Hi, hello, my dear CMA final students appearing for June 24 and December 24 exams. Welcome to the Rocket Revision on CMA Final Indirect Tax Laws and Practice Paper 19. So this video we are going to see first, so what is the question paper pattern and what are the chapters which you need to focus upon and what are the resources that you have in front of you so that you can make best use out of it. So first of all, this video is not for the previous syllabus students, this is for 2022 syllabus students. As you all know, from December 2023 onwards, so the syllabus 2022 has started, and in this, so they have made this syllabus more or less equal to CA final. So with few topics excluded and with few topics included, but majorly like 80 to 90% of the portion is common for CA final and CMA final when it comes to indirect taxes. Firstly, we will see the question paper pattern. This question paper pattern is based on various model question papers which I have seen published by ICMAI. So that is for June 24 also they have given one model question paper, and even for December 23 attempt. So the exam paper itself is there and the model question paper is also there. Based on that, what I have observed is that so there is a MCQ for 30 marks, and this MCQ 15 questions, 2 marks MCQs. Like CA final students, CMA final students do not have case scenario MCQs. It is like direct MCQs, question with 4 options, and you need to select, and there are some computation based questions are also involved. So total 30 marks you will be getting put together both GST and customs. Then next it is descriptive part. In the descriptive part you have 5 questions out of 7 questions. So you have 2 questions as choice. Each question carries 14 marks. That's where you will be able to get 70 marks. In this, surprisingly, what I have seen is that question number some 6 and 7. So 2 questions were on customs. So and 5 questions on GST. So if a student has left GST, customs and FTP, and if he has focused only on GST also, he will be able to attempt for 100 marks. But the problem is with respect to MCQs. So therefore, customs and FTP, so they are asking questions. So 2 questions dedicatedly on that and 5 questions on GST. But my advice to you is that so don't ignore any chapter. You prepare all the chapters so that you should be able to score the maximum marks that you can. And the level of difficulty, what I have seen when it comes to CMA final question papers, so it is not that difficult. So I can rate somewhere like 7.5 out of 10. So that is the level of difficulty that you have. It's not 9 out of 10 or 10 out of 10. 7.5 out of 10 is the level of difficulty that you have. So therefore it is not a very easy paper. At the same time, it's not a too difficult paper to handle. And there are few areas from where repeatedly the questions are being asked. So because of which I have made a ABC analysis based on your CMA final question papers. So this is based on December 23 exam plus model question papers. When it comes to A category topics in GST, value of supply. So lot of questions are they are being asked on value of supply. Then input tax credit, value of supply including the valuation rules, that is CGST rules related to valuation, input tax credit, place of supply, exemptions and RCM. When it comes to customs, 2 topics, valuation under customs and FTP. These 6 topics, if you are learning and going, so close to 70 marks will be from this only, including MCQs. Including MCQs and descriptive, close to 70 marks is from this A category topics only. Okay, so close to 70 marks. This itself will give you, this A category topics itself will give you close to 70 marks. Okay, just these 6 chapters if you learn and go thoroughly also, that will be sufficient. And then this refunds under GST, so from this you will be able to get some 15 marks minimum, 15 to 20 marks, and remaining marks is from all other topics. Okay, so remaining from all other topics in GST and customs. And this Category B, if you see, refunds under GST, TDS and TCS, returns, composition scheme, warehousing, baggage, and all other topics is the remaining topics. So these 6 chapters, if you focus, mostly like 70 marks is from this itself. This is what I have analyzed based on December 23 exam plus a model question papers. Okay, now, so therefore, now you know the strategy as to which topics you need to focus more. The next thing, so what are the extra topics? Suppose if you have already prepared based on CA final exams, so what are the topics which are there extra for CMA final? First we will see that. So if you look into the index, contents as per the new syllabus, contents as per syllabus, so this is your study material. In this they have given various modules up to module 27. So in this, the extra topics, if you see, walkthrough of GST portal. So what I'm going to give you is the extra topics that you have in CMA final compared to CA final. Okay, so walkthrough of GST portal. In this walkthrough of GST portal, purely it is practical aspects like how to do the registration and how to file the returns, etc. in the portal. So not even one question they have asked based on this. And next, step-by-step approach to start manufacturing in a bond in case of warehousing under customs. Again, no questions are asked on this. Then maintenance of records and filing of monthly returns by a warehouse keeper. So this also in extension to warehousing under customs. So not even one question on these 3 chapters, but duty drawback is an important area which was previously for CA final, but they have removed it now. So that is applicable for CMA final. And then SEZ scheme with amended SEZ rules. So these are the extra topics that you have in CMA final compared to CA final. Okay, so this walk through GST portal, step-by-step approach to start manufacturing in bond, maintenance of records and filing of monthly returns, duty drawback and SEZ scheme. Then what are the topics which are there in CA final but not there in CMA final? That we will see. So topics excluded. Okay, topics excluded from CA final to CMA final. Okay, so what are the topics which are excluded? If you see, this introduction to GST is not there, but you should be knowing it. Introduction to GST is not there, but maybe somewhere in MCQs it may be tested, so you should be knowing it. And then registration chapter is not there because this registration chapter came at inter level itself now. So due to that reason it is not there for you at final level. Then even tax invoice, debit notes, credit notes, etc. So tax invoice, then debit notes, credit notes, etc. That chapter is also not there. And next, even this ethics under GST. So in CA final, ethics in GST, like that one chapter was is there. So this is not there for CMA final. And when it comes to customs, so taxable event under customs, and then types of customs duties. So these are all the chapters. Okay, so types of customs duties, including the classification under customs, etc. So these are some chapters which are not applicable for CMA final exam based from CA final. Now, what I have done is that as I already did one rocket revision for CA final, those chapters which are equally applicable for CA final and CMA final, I have incorporated in this video, and I will be also taking the extra topics which are there for CMA final, mainly this duty drawback and SEZ, because these 3 areas are basic areas, like not even important at all. So this duty drawback and SEZ alone we will see. So if you watch this video completely for CMA final exam, that will be sufficient, that will be comprehensive. These topics and all I have excluded into my discussion. I have not given in this video. So only those topics which are there for CMA final exclusively, that I have included, plus these 2 extra topics I am going to discuss in this video. So with this, so the portion for your CMA final is covered and you can happily go for the exam. Okay. That is one aspect. Then next thing, what are the resources? What are the resources that we need to have so that we can get very good marks or the maximum marks that we can? So this study material, I have seen your study material, it is so comprehensive. Like my 3 volumes of resource book is there in the study material, which you, and more than that, there are a lot of clumsy things and all. So somewhat see 1107, 1200 pages and all is there. You don't have to really read this study material. Now what you need to do first, we will see for MCQ. For MCQ, what should we do? For MCQ, what we should do? For this MCQ, okay, so you need to just go to my website. Once you go to my website, you click on this learning portal. My website is tharunraj.com and click on this learning portal. In this learning portal, so do the login or sign up. If you are not having any account, you create an account using your Gmail and the password. You create an account. If you are already having an account, do the login. Once you log in, you will be able to see InQuest. So InQuest IDT. Actually, this is for CA final. I'll tell you how to make use of it. InQuest CA final book is there. So you click on this book and you don't have case scenario MCQs. Okay. What you have is only like chapter wise MCQs. Here I have given introduction to GST, taxable event under GST, like that. Chapter wise I have given. So you open on that. For example, place of supply. So in this place of supply, I have given lot of questions. And at the end of this PDF, you will be able to see the options along with the justification answers. Okay. So on an average, for place of supply, I have given some 40 questions. Like this, 30 to 40 questions I have given for every chapter. But there are few chapters which are not applicable for your exam now, like registration, don't read. And then what is this? Taxable event under customs, don't read. Classification and types of customs duties, don't read. So whichever chapters that are applicable for you, in that you just take the MCQs. For example, valuation under customs. So there also I have given a lot of MCQs. So just solve these MCQs. If you complete these MCQs and all, that will be sufficient for the MCQ part. And remember, these chapters which are not there for CMA final, don't read from that book. Okay. Remaining chapters you practice. And you can browse it through laptop or desktop or mobile. From anywhere you will be able to see that PDF. Okay. If you want to buy the book, sir, reading from the PDF will be difficult. I want to buy that book. You can also buy that book. You go to my website, you click on these books. Here there is InQuest IDT. So you can buy this book if required. If you can practice from that ebook itself, practice. It's not a PDF for download and print. It's a ebook. If you want to practice from there, you do that. Otherwise, you can buy this book. This is the first thing for what? For the MCQ. Then the descriptive part. For descriptive part, what you should do. So I have given one That's It book. So there is a That's It book. This is the That's It book for CA final. You can buy this That's It book because the lectures are taken from this book only. The videos are taken from this book only, and you can use. And again, few chapters which is not there, you don't have to read that. Okay. Remaining chapters you read, and these extra topics. So from where I can get these extra topics applicable for CMA final? So you go to the downloads. First thing, InQuest ebook, free. That's it. That's It book you need to buy. Then extra topics for CMA, 2 chapters I said na, duty drawback and SEZ. You can go to downloads. In the downloads, you can see last CMA final extra topics is there na. You click on this. So these are the extra topics, duty drawback and SEZ. Duty drawback and SEZ along with the illustrations, question and answers on duty drawback I have given in this. Okay. So you can go through this, and anyhow I will be doing a discussion based on this. So these are the resources you need to have. What are the resources? Just 3 resources. Number 1, MCQ book, that InQuest book, ebook, free. Number 2, That's It book, you need to buy. Number 3, the CMA final extra topics PDF. So this will take care of your descriptive part. And then one mighty 50 questions. Okay. So that also I will be uploading in the same place, downloads. So I will share some mighty 50 questions for CMA final. So you practice those mighty 50 questions. So before the exam, that will be sufficient. These 4 resources will help you for cracking the CMA final exam. So therefore, this will be sufficient for you. I have given you ABC analysis and what are the resources that are required. Okay. So now we can move on to the discussion. So which is related to, the chapter wise discussion. And as I already told you, I have taken the videos from the CA final rocket revision, applicable videos, and I have given, and 2 extra chapters of CMA final that I will be giving at the end, that is duty drawback and SCZ. So see this basic concept, actually they removed from the syllabus itself. They just gave it like an appendix to the first chapter in the new study material. Chapter number 1 itself is supply under GST. In that somewhere below in appendix they gave this. So I don't think so any question will be tested on this. Even if it is tested, it will be mostly MCQ type only. So quickly we will see this. You all know all these things. So when is GST implemented? With effect from 1st July 2017. And how GST is formed? A lot of indirect taxes which we had in the past that got subsumed into GST. So whether all central government levies got subsumed into GST, everything got subsumed into GST except customs duty. So excise duty, service tax, central sales tax got subsumed into GST. Here related to central sales tax, you should know one point, that central sales tax is levied by central government, but it will be collected and retained by the state government. So that will not go to the center, even though it was levied by central government. Okay. Then customs duty is outside the ambit of GST. However, additional customs duties. So 2 additional customs duties called as CVD and SAD, countervailing duty and special additional duty. These 2 got subsumed into GST because basically this countervailing duty is to counterbalance excise duty. Excise duty got subsumed into GST, due to that reason CVD also got subsumed into GST. Then special additional duty was to counterbalance sales tax. As sales tax got subsumed into GST, so this SAD also got subsumed into GST. So therefore, these additional customs duties, when it will come on import only, these additional customs duties basically will come. So this will not come on export. Additional customs duties will come only on import of goods. On import of goods, we should have paid additional customs duty, but as we are not paying this additional customs duties now because it got subsumed into GST, so on import of goods along with customs duty, we are also required to pay IGST. Okay. Then indirect taxes levied by state government in the past, only these specified indirect taxes got subsumed into GST. Total 6 indirect taxes, that is value added tax, advertisement tax, luxury tax, entertainment tax, lottery and betting tax, and purchase tax. Purchase tax also known as octroi, only 6. Apart from this, other indirect taxes levied by state government or indirect taxes levied by local authorities not got subsumed into GST. There is a possibility of asking this as a MCQ. Which of the following got subsumed into GST? A. Value added tax. B. Central sales tax. C. Entertainment tax levied by local authority. D. None of this. What will be the answer? C. Entertainment tax levied by local authority, because entertainment tax levied by local authority, not only entertainment tax, any taxes levied by local authority not got subsumed into GST. Okay. So that is this point. Then what about the professional tax which will be levied by the state government, whether it got subsumed into GST or not got subsumed into GST? Not got subsumed because we don't have that in the list. So value added tax, advertisement tax, luxury tax, entertainment, betting tax, purchase tax, but we don't have the professional tax. So the professional tax not got subsumed into GST. So this alone you please remember. Then entertainment tax, there are 2 entertainment taxes. One entertainment tax which is levied by state government got subsumed into GST, but another entertainment tax which is levied by local authority not got subsumed into GST. Then India has adopted the dual GST model. So what is dual GST model? On the common tax base, both central government and state government can levy tax, that is known as dual GST model. And this dual GST model is adopted from Brazil and Canada, where both CGST has power to levy tax on the common tax base, and GST Council. So basically GST Council is the decision making body under GST. So GST Council derives its power from one article. So article 279A of the Constitution, Article 279A of Constitution, and this is constituted by President of India. But who is the head of this GST Council? Union Finance Minister is its chairman, and basically it will have 33 members. Who are those 33 members? So one Union Finance Minister and 33 state ministers. How's are 33? We have 28 states and 3 union territories with state legislature. What are they? Delhi, Puducherry, then Jammu and Kashmir. These 3 are considered as union territories with state legislature, treated as state only under GST. And for this 33, we have 33 ministers, that is the 31 states, 31 state ministers plus 1 union finance minister, and remaining 5 union territories without state legislature. What are those 5 union territories without state legislature? Ladakh, Andaman and Nicobar, Lakshadweep, Daman, Diu, Dadra, Nagar Haveli and Chandigarh. So for these 5 union territories, we'll have 1 union MP in charge of the revenue. So that person also will be there. So total 33 members. And what is the quorum? 50%. So 50% should be present in the meeting. Then only it will be called as a valid meeting. In that meeting, central government is having how much weight? 1/3 weight. Whereas state government is having 2/3 weights. And what should be the majority? A simple majority is sufficient or a weighted majority is required? Weighted majority. And what is that weighted majority? That's where for central government vote 1/3 and for state government vote 2/3, and that too it should be like a special resolution majority. What is that? 3/4. 3/4 majority is required. Then next aspect, we need to know what are the types of GSTs. So how many GSTs we have? 5. CGST, levied by central government. On what supply? Intra-state supply. What is a intra-state supply? If location of supplier and place of supply is in the same state or same union territory, then it is intra. If location of supplier and place of supply is in 2 different states or 2 different union territories or a state and a union territory, then it will be known as interstate supply. So in case of intrastate supplies, we will have CGST plus SGST if it is within the state. Example, location of supplier Tamil Nadu, place of supply also Tamil Nadu. So Tamil Nadu is a state. So CGST levied by central government plus SGST levied by state government. Suppose if the location of supplier is in say Ladakh and place of supply also Ladakh, then it will be intrastate only. And what is the type of GST? CGST plus UTGST, Union Territory GST. But in Jammu and Kashmir, it will not be UTGST, it will be SGST only. So these 3 basically CGST, SGST and UTGST levied in case of intrastate only. Okay. And who will levy CGST? Central government. SGST, state government. UTGST we don't have any separate government. It will be under the control of central government. So central government. Whereas IGST, when IGST is levied in case of what type of supply? IGST levied interstate supply. Interstate means what? I have given next page. What is the meaning of intrastate and interstate? Intrastate means location of supplier, place of supply in same state or same union territory. Interstate means location of supplier, place of supply in 2 different states or 2 different union territories or a state and a union territory. So IGST is levied. Who will levy this IGST? Central government will levy on interstate supply. Then there is something called as GST compensation cess. GST compensation cess is levied only on notified goods. Sir, what are those notified goods? That you don't have to remember. So there is some list of notified goods. So if at all in question, if there is GST compensation cess given, then only you consider, otherwise don't consider. And sir, how GST compensation cess will be computed? Just like how GST is computed, the same way. For example, 10 lakhs is the value. GST is 28%. GST compensation says 12%. Now what you will do with 12%? While adding the, while computing the GST compensation, don't add GST. GST 28% also on 10 lakhs and compensation says 12% is also on 10 lakhs only. But don't add this and show like 28 plus 12, that will be 40%. Always you need to show the taxes separately. So show GST at 28%, compensation says at 12% like that. But these two will be computed on the same value only. You understood? So GST compensation says is levied on notified goods. Some examples of notified goods. What are the examples of notified goods? Tobacco products, pan masala, and then we have this aerated waters, and then motor vehicles. These are some examples on which there is GST compensation cess. Mainly, what is the purpose of this GST compensation cess? This is levied on notified goods which are sold across the country, anywhere it may be sold. And this GST compensation cess, which is collected by the central government, will be used to compensate the states on account of the loss incurred by them due to implementation of GST. So, to compensate the states on account of implementation of GST, and shall be levied up to, what is the date up to which the GST compensation cess can extend? 31st March 2026. For MCQ purpose, it will be useful. 31st March 2026. Can it be extended even beyond that also? Yes, as and when the GST Council decides, they can extend it for a further period of time as well. Right now, it is up to 31st March 2026. Then, IGST is levied by central government, we know that. And out of this IGST, 50% will go to whom? 50% will go to the consuming state based on place of supply. So, in case of B2C transactions, I am not talking about B2B transactions, in case of B2C transactions, or in case of, like B2B transaction, but recipient is not able to take ITC. So, in these two cases, what are the two cases I am referring to? What is the type of supply? Interstate supply. The type of supply is interstate supply. And what is the transaction? B2C, okay, or B2B. B2C means what? Recipient is unregistered. B2B means what? Recipient is registered. B2B where recipient cannot avail ITC. Why recipient cannot avail ITC? There are many reasons. So, maybe he is using it for exempted supplies, or he is using it for non-business purpose, or he is blocked credit, or he may not be able to take it within the time limit. So, any reason. So, he is not able to take the ITC. So, in these two cases, interstate supply, B2C or B2B where recipient cannot avail ITC, what happens is that 50% of the IGST, 50% of IGST given to which state? Given to consuming state. Given to consuming state. Now, say for example, it is like place of supply is Karnataka, location of supplier is Tamil Nadu. Then IGST will be collected. In that IGST, 50% will go to Karnataka. So, that is the logic behind it. Sir, what if it is B2B and recipient can take ITC? If recipient can take ITC, we need to see how he is going to use that ITC. See, it is very simple. 50% of IGST is given to the consuming state when? If it is B2C transaction or B2B where recipient cannot avail ITC. Now, here, what if location of supplier and place of supply? Location of supplier is Jammu and Kashmir, place of supply is Ladakh. Then nature of supply, if you see, the nature of supply is interstate, and then what will happen to the revenue, IGST revenue or GST? So, here it is collected by, who will be collecting this? Central government, and 100% retained by central government only. Why 100% retained by central government? Because Ladakh is under the control of central government. Suppose if it is reverse, location of supplier is Ladakh and place of supply is Jammu and Kashmir, the nature of supply is again inter, but Jammu and Kashmir is union territory with state legislature, means there is a separate government for that. So, therefore, even though it is interstate IGST collected by central government, 50% shared with Jammu and Kashmir. You understood? So, this is what you need to remember. 50% IGST given to consuming state or union territory with state legislature. State legislature. Now, sir, what if it is an interstate supply and if it is B2B, not B2C, B2B and recipient can avail ITC, opposite of the above. Then in this case, interstate supply, B2B and recipient can avail ITC. What will happen? Simple, that IGST credit, what we are going to do? So, we have a IGST credit to the recipient. That recipient is going to use IGST credit against IGST payable. then we can't do anything. Still it is in the IGST account only. So then suppose if it is used for CGST payable, so then what will happen? Entire amount will go to, entire amount goes to central government, correct or not? Suppose if the IGST credit is used for SGST payable, then also entire amount goes to state government. Okay. Suppose if this IGST credit is used for UTGST payable, then what will happen? Everything is R here, either this or this or this or this. If it is to UTGST payable, then what will happen? Entire amount goes to central government. Okay. Now when IGST credit is utilized for payment of IGST payable, so it will be still in suspense account. Okay, because we cannot distribute it, still it is in IGST account. Suppose if IGST credit is utilized for payment of CGST liability, what will happen? So fully it was in suspense, now it will go to central government treasury fully. If it is IGST credit utilized for payment of SGST payable, previously it was in suspense, now it will completely go to state government. IGST credit, if it is used for payment of UTGST is under whose control? Central government. So again completely it will go to central government. So in this regard we need to know IGST settlement as well. So what is this IGST settlement means? IGST settlement means it's like two situations IGST settlement will happen, and one situation what we have seen is above, that is when IGST credit is utilized for payment of SGST payable. So then central government will, because this IGST credit means what? This money is collected by whom? Central government. So central government will give this money to state government. Whereas when SGST credit is utilized for payment of IGST liability, then also this problem will happen, that is state government has to pay that amount to central government. So what are the two situations where IGST settlement will happen? Number one, IGST credit for CGST payable, IGST credit for SGST payable. When IGST credit is used for SGST payable, what will happen? CG shall transfer or shall pay to SG. Then second situation, when SGST credit utilized for IGST payable, even in this case there will be IGST settlement. Who will make payment to whom? State government shall pay to central government. So these are some connecting topics related to this, and that's what I have given here. Okay, so don't worry, parallelly if you are not able to copy also, anyhow as I said, by the end of the lecture I will share this PDF, and even it is there in the YouTube also. YouTube, in the description I will be giving this PDF, in case if you miss in Telegram also you can check there. Okay, don't worry about this. So enjoy on learning the subject first. Okay, so because it's purely a revision for that purpose. Then so that is what I have given. If place of supply cannot be ascertained, it shall be apportioned between the states based on turnover of the supplier during the financial year. First what we need to do, IGST levied by central government, 50% will be transferred to state government based on place of supply. So that's what we have seen. And also we have seen when it will be. If it is B2C or B2B where recipient cannot avail ITC. And interstate supply, B2B and recipient can avail ITC, what will happen we have seen. Now what is a crucial point here? So 50% IGST given to consuming state. But how do I know consuming state? So consuming state is known based on place of supply. So what if the place of supply is not ascertainable? So then they have given one provision which says that it shall be apportioned between the states based on the supplier during the financial year. For example, my turnover during this financial year from Tamil Nadu to Andhra Pradesh 20 lakhs, Tamil Nadu to Karnataka 10 lakhs, Tamil Nadu to Kerala 5 lakhs. So in 20:10:5 ratio, this will be distributed between Andhra Pradesh, Karnataka and Kerala accordingly. You understood? That is this. So it shall be apportioned between the states based on turnover of the supplier during the financial year. Then state of Jammu and Kashmir is divided into two union territories. So that you should know. Union Territory of Ladakh, Union Territory of Jammu and Kashmir. Ladakh is a union territory with legislature or without state legislature? Without state legislature. And Union Territory of Jammu and Kashmir is with state legislature. Then Union Territory of Dadra and Nagar Haveli and Union Territory of Daman and Diu. So this got merged into a single union territory. So therefore, if any supply takes place between Dadra, Nagar Haveli to Daman and Diu, don't write it as interstate. It should be intrastate. Then last we have GST network. So GST network provides shared infrastructure. So between central government, state government, banks and taxpayers for the purpose of implementation of GST. Basically they provide information technology infrastructure for implementation of GST, and it can be referred to as common portal, and provides services to taxpayers, central government, state government, banks and other stakeholders. So basically what are the functions of the GST network? It facilitates registration. So if you want to do registration or payment of taxes or filing of returns or settlement, just now we saw settlement of IGST. So SGST credit for IGST liability, IGST credit for SGST liability, that is known as settlement of IGST, e-waybill, etc. So these are the functions of GST network. And don't give much importance to this because basically this is not there in the regular syllabus. It was just given as appendix because at intermediate level to final level students, those who are coming for a refresh only, this has been given. So maybe 1 or 2 MCQs may come, otherwise it may not be. Then now we are moving on to one important chapter, that is input tax credit. And you might be knowing what is input tax credit, etc. and all, but I just wanted to give you a quick recap of that. Input tax credit basically is tax paid on inward supplies. So you can see page number 79. So you have some information in page 79 related to this input tax credit. So if you have book, you can refer, otherwise wherever you are referring, you refer from there. So input tax credit is basically what? I have some inward supplies. Inward supplies means what? My purchases. On my purchases, whatever GST that I have paid is known as input tax credit. So what is input tax credit? GST paid on inward supplies. What I can do with that input tax credit? I can utilize it for payment of GST on my outward supplies. Okay, this is basically what input tax credit is all about. So that I have some purchases. On that purchase, I paid some GST. I will take it as credit and I will set off against the GST which I have to pay on my sales. So this net GST payable is what? Gross GST payable, that is tax on outward supplies minus input tax credit is called as the net GST payable. In this, we have some returns which you should be knowing first. GSTR1 is a return that contains the details of outward supplies. So every registered person is required to file a GSTR1. So GSTR1 contains what details? Only outward supply details. It will not have anything else. And these outward supply details furnished by every registered person. Basically this will have invoice wise details or consolidated details. GSTR1 will have invoice wise details. GSTR2A and 2B both are inward supplies. So this we will not file. So based on our supplier's GSTR1, the portal will make us available GSTR2A and GSTR2B. So our supplier should have filed GSTR1 and he should have mentioned our name as his recipient. Our GSTN should be mentioned so that it will come to us. Who are we? Recipient. While studying input tax credit chapter, you keep yourself from the recipient point of view and see the provisions. Okay. So your recipient basically and your supplier will be filing GSTR1 and he will be reporting the details of outward supplies in his GSTR1 by mentioning your GSTN so that it will come in your GSTR2A and 2B. So both are containing inward supply details, but how is it different? GSTR2A is basically, a dynamic statement which will keep on changing, keep on updating, but 2B is a static document. Now, for the purpose of availing ITC, whether 2A is relevant or 2B is relevant, which is the relevant document? 2B is only relevant, so 2A is not relevant. 2A is just a reference document only for the time being. So 2B is only the document on the basis of which ITC can be availed. So 2B is a static month-wise auto-drafted statement for regular taxpayers and it is like 2A but remains static. Static means what? So up to a particular date, if your supplier has filed the GSTR1, then it will be made available to you. What is the due date of GSTR1? 11th of the month following every month. And when the 2B will be generated? 13th of the month following every month. And GSTR1, there is a quarterly return also. So, but that comes under QRMP if opted, quarterly return monthly payment. Otherwise, basically GSTR1 is a monthly document. So, what is the time limit of GSTR1? 11th of next month. 11th of next month is the due date. Whereas 2B, by when it will be made available? 13th of next month. 13th of next month means by 13th, whatever are the details which are required to be furnished, if it is furnished, then only the data will be made available to us in 2B. But 2A is not like that, it will keep on changing, means even if the GSTR1 is filed late, it will be updated in 2A. Then 3B is a consolidated document that contains all outward supplies, inward supplies details, GST payable and GST paid. Now, the difference between 2A and 2B may not be important for exam, but you should be knowing it. So, type of document, if you see 2A I told you dynamic, but 2B will be static. TDS TCS details, unfortunately it is not reflected in GSTR 2B, it will be reflected only in GSTR 2A. That is another difference. Next, third difference is that details of invoices, if GSTR1 filed after due date, what is the due date of GSTR1? Just now we have seen 11th of the next month. If the GSTR1 is not filed by your supplier by 11th of next month, so it will not come in 2B, but it will come in 2A. So 2A the details are reflected, 2B not reflected. However, it will be reflected in 2B of next month. So however, it is reflected in subsequent month 2B. And what is the purpose of this GSTR 2A? Just for reference purpose only, whereas 2B is for the purpose of availment of ITC. What is availment of ITC? Taking ITC. So remember three words: availment of ITC, taking ITC, utilization of ITC, set off of ITC with our liability, reversal of ITC, reduction in ITC. So availment, taking ITC, utilization, set off with liability, utilization, set off. So reversal, reducing. All these three will be done in GSTR 3B. Okay. Availment of ITC we can do in 3B. Reversal of ITC we can do in 3B. Utilization of ITC also we will be doing in 3B only. And for availment of ITC, 2B is a document, which means how much ITC we can take. Only that ITC which is reflected in 2B. How this is reflected in 2B? Based on our supplier's GSTR1. This is what Rule 36 sub Rule 4 says. So section 41 read with Rule 36 sub Rule 4. Only those ITC which is reflected in GSTR 2B can only be taken. This is called as matched ITC. So see that. So this is the information we are trying to understand. So where is this information given? This information is given in section 41 read with. Section 41 read with Rule 36 sub Rule 4. Section 41 of CGST Act and Rule 36 sub Rule 4 of CGST rules. What does it say? So only matched ITC can be taken. What is that matched ITC? Supplier will file the details of outward supplies in GSTR1 or IFF. What is IFF? Invoice Furnishing Facility. A person who is under QRMP, they will be filing returns on a quarterly basis. We all know that only if the GSTR1 is filed, it will come in 2B. Means if our supplier is under QRMP, he will be filing GSTR1 on a quarterly basis. Then this data will come in our 2B on a quarterly basis. Until that point of time, we cannot take ITC. So that's why they have launched this IFF. So your supplier, even though he files the GSTR1 on a quarterly basis, but for the first month and second month, he can file a invoice details in IFF, Invoice Furnishing Facility, so that the data will come in your monthly 2B itself, even though he has not filed GSTR1. So therefore, in our 2B, the data will come from GSTR1 of the supplier as well as IFF of the supplier. So GSTR1 or IFF, supplier reports the outward supply details and it should be filed by the due date. That is very, very important, because just now we have seen, suppose if the supplier files GSTR1 after the due date, it will come in our 2B, but not this month 2B. It will come in next month 2B. So this is known as matched ITC. So this much only can be taken. But section 41 says, this is given in Rule 36 sub Rule 4. But section 41 says we can do self-assessed ITC. 36 sub Rule 4 says only matched ITC can be taken. Section 41 says self-assessed ITC can be taken. What is that self-assessed ITC? Matched ITC plus the 6 adjustments is known as self-assessed ITC. What are these 6 adjustments? First 3 adjustments related to, I am supposed to take matched ITC. It is reflected in 2B. it is reflected in 2B, but I should not take ITC. Why I should not take ITC? Because it is blocked credit or used for non-business purpose or used for exempted supplies. So these are the three things. So these three things basically are what? Reflected in 2B. Reflected in GSTR 2B. But ineligible. You should not take. Even though it comes in 2B, but you should not take. Blocked ITC, used for non-business purpose, used for exempted. Then there are three things which is not coming in 2B, not reflected in 2B, but you are eligible, you can take. Not reflected in 2B, not reflected in GSTR 2B, but eligible. What are they? GST under RCM. So whatever RCM liability that I have paid, so means what? I have some inward supplies on which I am paying some GST under RCM. So my supplier may not report these details in his GSTR1. If the supplier reports the details in GSTR1, it will come in my 2B. Then the question of taking ITC problem will not arise. So what happened here? My supplier did not report in GSTR1 because it was an outward supply covered under RCM on which he is not having the liability, I am having the liability. So he did not report in GSTR1, but I have to pay the GST under RCM. Whatever GST I paid under RCM, can I add it to my ITC? Yes. Same month, yes, no need to wait for next month. Same month itself you can add it for ITC and you can adjust it only against FCM liability, because whatever GST that we have paid under RCM, so we will take it as ITC, but ITC cannot be used for RCM liability itself. ITC can be adjusted only against FCM liability. So keep that point in mind. Then next, re-availment of ITC reversed earlier. What is that? Initially we availed the ITC, that got reversed. Again we are re-availing now. It may not come in this month 2B. Why it will not come in this month 2B? Because it is not pertaining to this month. This was pertaining to some period before. We availed, we reversed. Again we are re-availing. It would have been reflected in the 2B of some that month. It may not come in this month. Even then we can take ITC. Then third one, ITC pertaining to the earlier tax periods, not availed in that period, but we are availing now. There is a time limit for availment of ITC. What is the time limit for availment of ITC? 30th November of succeeding financial year or date of filing annual return, whichever is earlier. That is the time limit for availment of ITC. By the time limit, previously it was September like that. So 30th November of succeeding financial year or date of filing annual return. Due date of filing annual return or actual date of filing annual return? Actual date of filing annual return. Whichever is earlier is the time limit. That is the time limit by which we should take the ITC. So there is a time limit for availment of ITC. But for utilization of ITC, there is no time limit. We can adjust it against our liability any time in future. Now what happens is that somewhere in April I have made the purchases and I want to avail the ITC in the month of November, this year only. So now, can I avail the ITC? Yes, but it will not come in November month 2B. It would have been reflected in April month 2B. Can I take the ITC now? Yes, because you are within the time limit. Yes, and you can take ITC, but it will not come in this month 2B. It's okay. It was reflected in one month, some month before. So it's okay, you can take the ITC. These are the three things wherein even though it is not reflected in 2B, but eligible and you can enjoy the ITC. That is GST under RCM. Re-availment of ITC reversed earlier, ITC not availed in earlier period but reflected in 2B of that period. Now, because we are taking this extra ITC, what will happen? So, we will get a notice. Because of this, we will get a notice in terms of Rule 88D. So, that is also an amendment for this May 24 exam. Rule 88D. So, therefore, read with Rule 36.4 and Rule 88D. What does this Rule 88D says? Rule 88D says whenever you have availed ITC in your 3B more than your 2B. So when 88D will come? Whenever you have availed ITC in your 3B more than your 2B. Okay. At that time you will get a notice. Sir, can I take, sir? Yes, because 3B ITC is basically editable. So we can edit that. We can enter the amount, whatever amount you want, you can enter that. But the problem is, If you are entering some number which is your lucky number and all, so we will get a notice. For what reason? Boss, in your 2B, this much only was the ITC. You have taken extra. So show us the reason why you have taken excess ITC. So one notice will be given to us. Okay. So that notice will be form GST DRC 1C. Okay. One notice we will be getting, and based on that notice, so we need to give a reply. What is that reply we will be giving? Maybe it is genuine case. These are the 3 genuine cases. What are these 3 cases? Sir, I paid some GST under RCM. So I will reply. So this is the RCM liability. So please refer to my 3B, table 3. I have mentioned some RCM liability. So this much only I am taking as ITC, justifiable. Number 2. So reavailment of ITC reversed earlier. So in one 3B I would have reversed the ITC. So I will refer 3B of so and so month, where I have shown the reversal of ITC. Whatever I reversed only, I am reavailing now. So justifiable. Number 3. It pertains to 2B of 1 month, but I have not taken ITC in that month, but now I am taking the ITC. So you just refer in which month 2B it was reflected. So but you have not taken. So you give the reference of 2B and 3B of that month, and so that it is justifiable. These are the 3 cases it is justifiable. Other cases it is not justifiable. So accept and pay. You understood? So if you are not accepting and paying, then there will be other consequences. So what are those other consequences? The recovery will be initiated. Okay. So that is this information. Rule 88D we should refer along with this. So that rule 88D is in returns chapter. So you can give the reference of a page here. Refer page number 134. Refer page number 134. See, because you should learn it properly by interconnecting. That's why. Rule 88D. Page 134. This rule 88D ka information is in 134. So basically, when 88D will come into picture, ITC in GSTR 3B greater than ITC in GSTR 2B. Now, along with 88D, first we will refer 88D in page 134. Along with that, we should also see 88C. So look into 88D, what does it says? Trigger point when 88D will come, because it's an amendment here. That's why I am going little slow. It's a May 24 amendment. Difference in ITC claimed, that is credit availed in 3B exceeds the credit as per auto generated statement in 2B. So we will get a notice. What is the format of the notice? GST, you remember. Which subject we are studying? GST. DRC, demand and recovery. They should recover it from us now. So demand and recovery, DRC. 1. Okay. So remember the alphabet before D. What is the alphabet before D? C. So DRC 1C is the form. Okay. Make an effort. Remember this, because it's an amendment. By mistake, if they ask, by mistake we write, they will think that we are intelligent. Of course not, but we will get marks. You understood or not? So that's important, because world is everywhere cheating only. So then communication by, so we get a department notice, and either it will be uploaded in our portal, plus you will also get the email intimation. What is the reaction time? 7 days. Within that 7 days, what you should do? You should give a reply. That reply is in part B. Part A they will give notice, part B of the same form. Part B of the same form you need to give the reply. So what are the options available to you? Number 1, pay the difference. If it is not the genuine credit, pay the difference. Option 2, if it is genuine credit, give the reply, explain the difference, or partly pay and partly explain the difference. Okay. Then If no response or unsatisfactory response, what will happen? That's what I told you. So you are not giving an explanation, neither giving explanation nor accepting the difference and making the payment. So then in that case, they will give a notice under 73 or 74. Mostly they will invoke 73 only. Mostly they will invoke 73 because it is clearly evident. This is a mistake that do not involve fraud. Sir, when 73, when 74? If there is non-payment of GST, short payment of GST, non-payment of GST means GST you are required to pay but you have not paid. Short payment of GST, you have paid less. Wrong availment of ITC, you are not supposed to take the credit but you took the credit and utilized it. Or wrong utilization of ITC, you are supposed to take the credit, you took the credit but you have utilized it wrongly. Wrong utilization of ITC. Or erroneous refund, you are not supposed to get the refund but you got the refund. In these 5 cases, there is a payment of tax, something you have to pay. First case, non-payment, you have to pay. Short payment, you paid less, you have to pay. Wrong availment utilization of ITC, unnecessarily utilize the ITC, because of which your liability will come down. So there also there is some payment of tax. Erroneous refund, you are not supposed to get the refund, you got the refund, so you have to pay that amount. For recovering this amount, they will invoke either 73 or 74. If it is on account of fraud, if it is on account of fraud, fraud means what? Intention to evade, then it will be section 74. If it is non-fraud, there is no intention to evade, by mistake only it has happened, clearly evident. When there will be intention to evade, so I planned it in such a way that so no one can identify this, that is called as intention to evade. But evident clearly, in 3B I have taken more ITC, in 2B there is lesser ITC, there is no intention to evade. So therefore in that case usually they will invoke 73. You got it? So 73 will come in which case? Fraud or error? Error means no intention to evade. 74 will come in case of fraud, that is intention to evade. So what they are doing? They are giving a notice. Jolly, already one notice we got, now another notice, second notice, you understood. But they will not do recovery because this they will be testing in exam. Recovery, direct recovery can be made under section 79 if there is a difference in ITC in 3B and 2B. Explain. What will you explain? See, question itself you did not understand. Then where from you will explain? You understood. So, direct recovery can be initiated under section 79 in case of difference in ITC. That is, ITC availed in 3B more than ITC as per 2B. Explain. Like that this question will come here. Definitely it will come here. Okay. So, when that question sees, you will not understand what to write. You will write about rule 88D and all. But it is like they are asking you one question but you are answering something else. So, what is the correct answer, sir? Sir, see there. Recovery cannot be made if there is any difference in 3B and 2B. First a notice to be given and a 7 days time limit to pay the difference or give the explanation. If not, the another notice will be given under 73, 74. And after 73, 74 notice, one order should be passed under 73, 74. Thereafter only recovery can be made if you are not making payment within 3 months after order date. Because 73, 74 provision says first a notice will be given. After notice, they will pass a order. After passing order, they will give a time limit for you of 3 months either to pay that or go for appeal. If you are not going for appeal or neither making payment, in that case only recovery will be initiated. You understood? So that is what you need to write. So you should write that the given statement is incorrect. Recovery cannot be initiated under section 79 on account of difference in ITC in 3B versus 2B. As per rule 88D, you got it? As per rule 88D, a notice to be given in form DRC 1C and within 7 days, the taxpayer has option to either make the payment of difference or explain the reason for difference. if no action is done by the taxpayer within such 7 days, a notice can be issued under section 73 or 74, and after that notice, so an order will be passed as per the time limit under 73, 74. After the order has been communicated to the taxpayer, within 3 months, if the taxpayer neither preferred an appeal against that particular order, nor he accepted the order and made the payment of tax, interest and penalty, then recovery will be initiated. Got it? So that is how you need to write the answer. You got it? Then next, impact on filing of returns or access to GST portal. Okay, until that point of time, what will happen? So because it is taking some time now, 7 days time is there, and thereafter we have to pay. So it takes some time. Till that time, what will happen? If you are not doing that, what will happen? One notice will be given under 73, 74. Okay, in this 7 days, what will happen? In this 7 days, what will happen? You are not allowed to file the return in GSTR 1. Means till the time you make the payment of the difference or explain the difference to their satisfaction, you cannot file GSTR 1. So it will be blocked. GSTR 1 will be blocked. And once GSTR 1 is not filed, GSTR 3B also cannot be filed, because now we have sequential filing of returns. What is sequential filing of returns? Without filing GSTR 1 of previous month, we cannot file the 3B of the current month. Without filing GSTR 1 of the previous month, we cannot file 3B of the previous month. And without filing GSTR 1 and 3B of the previous month, you cannot file the GSTR 1 of the current month. Without filing GSTR 1 of the current month, you cannot file 3B of the current month. It's like a sequential we have. Got it? First GSTR 1 of previous month, then 3B of previous month, then GSTR 1 of current month, and then 3B of current month, like that only. So if you are not able to file GSTR 1, consequently 3B also cannot be filed. That is what it is. So you are not supposed to file GSTR 1 is given in Rule 88D. But this point is not given in Rule 88D. It is a connecting point, different place. And another connecting point, because you are not able to file GSTR 1 and GSTR 3B, so e-way bill also will be blocked. If GSTR 1 not filed for 2 consecutive tax periods, like 2 months continuously you are not able to file, e-way bill will be blocked. E-way bill facility gets blocked for your outward supplies. Also, one more consequence is there. As the ITC availed in 3B is greater than ITC availed in 2B, so your registration also will be suspended. That is one of the reasons for cancellation of registration. There are many reasons for cancellation of registration. One of the reasons for cancellation of registration is what? ITC availed in 3B which is greater than 2B. Actually this point 2, 3, 4 not given in this rule, given in different places which I have just connected. So because this also can be tested as a question, like what are the consequences with respect to the taxpayer when the notice is served under DRC1C or notice is served under Rule 88D. Anyway they can ask the question. What are the consequences? You need to write these 4 points. Okay. Following are the consequences if the taxpayer has neither paid the difference nor has given the explanation within 7 days from the date on which notice has been served in DRC1C. What is that? First point, GSTR 1 cannot be filed and it gets blocked, because of which GSTR 3B also gets blocked. If the GSTR 1 and 3B not filed for 2 consecutive tax periods, e-way bill also gets blocked. And this is one of the reasons for suspension of registration. So these 4 points we need to write. This is how 88D can be tested. Okay. Very, very important. This one big amendment which definitely they will be testing. When we read 88D, along with that 88C also we should read. What is this 88C? 88C says that my liability in GSTR 1 is greater than liability in GSTR 3B. When this situation will happen? I have poured in lot of invoices in my GSTR1, but not all invoices I have paid the liability in my GSTR3B. So when there is a difference in this, for example, as per my GSTR1, liability is 18 lakhs, but in 3B, I have paid only 8 lakhs, means 10 lakhs difference is there. You understood? Means what I am doing, I am putting the invoice in GSTR1, but I am not discharging the liability, because at the time of filing GSTR1, we don't have to pay tax. At the time of filing 3B only, we should pay the tax. So I have suppressed my tax liability. In that case, so they will be giving a notice in DRC 1B. Remember the alphabet before the rule number. This which rule? 88C. So C, before C is B. So DRC 1B. So what is the trigger point for 88C? Liability declared in GSTR1 exceeds the tax payable in 3B. So we get a notice, same, but notice form only will differ. What is that notice form? Here 1B, here 1C. And communicated by way of uploading in the portal plus email. And what is the response time? 7 days. And what is the response to be filed in part B of DRC 1B? Same logic, part A, part B, part A, part B. Okay. Then options available, ditto, pay the difference, explain the difference, or partly pay and partly explain the difference. Same story. And why there will be reasons to explain the difference? So there could be some genuine reasons also. Like I have added an invoice, but I forgot to adjust the advance. Actually 10 lakhs, 8 lakhs advance, already I paid GST, but now I added invoice for 10 lakhs. So now in 3B I will pay liability only for 2 lakhs, because on 8 lakhs already I paid. But this adjustment of advances I should have done in my GSTR1, I have not done. Because of that reason this difference may happen. So there could be genuine reason also. So pay the difference, explain the difference, or partial payment and explain the balance. If no response or unsatisfactory response, what will happen? This is the place where direct recovery will happen. Here no notice again. No notice again. Why no notice again? This is called as self-assessed tax not paid. Self-assessed tax not paid. Direct recovery can be initiated under 79. No waiting. No waiting, boss. 7 days over, immediately they will do recovery. So this is called as direct recovery. Recovery of tax under section 79 plus liability posted in electronic liability ledger. So this is known as recovery of self-assessed tax. Recovery of self-assessed tax under section 79. Usually in 73, 74 we discuss one time limit. First they will give a notice. In case of 73, 74 what they will do? First they will give a notice. After notice they will pass a order. After order only they will do recovery. Correct. So this recovery will be under section 78. This recovery will be under section 78. And what is the time limit we have for this order to recovery? 3 months. 3 months. Okay. So within this 3 months, if you are not making the payment or you are not going for appeal, then only they will do this recovery. So this information related to recovery and notice etc. is in demand and recovery chapter. I just connected it here. So now going back to the input tax credit where we started. So page 79. So I just discussed now rule 88D. Along with rule 88D we have also discussed 88C. On this rule 88D and 88C also questions can be asked. So a lot of questions are possible in these areas. Then next. One more rule is that section 41 read with rule 37A. This is also an amendment, but this was an amendment for last attempt itself, but for November 23 they have not tested much on this particular rule 37A. So because of that reason, definitely this time you can expect a question. So what is it all about? Simple. The supplier will report the details of invoice in GSTR1 and the GSTR1 is filed within the due date. Same, no change. We have seen already here. Supplier filed GSTR1 and it is filed by the due date. So supplier filed GSTR1 and it is filed by the due date. Based on this, the data of inward supply is made available to recipient in 2B, correct? ITC reflected in GSTR 2B of the recipient. And whatever ITC that is reflected in 2B of the recipient can be availed in GSTR 3B. So that is known as ITC availed in 3B, self-assessed ITC. And of course, after making these adjustments, we can take the ITC here in 3B. Now what happened? Supplier has not filed 3B. Even then, when can we take ITC? Yes, that's what section 41 says. Your supplier just report the data in GSTR1, you happily take the ITC. The moment it comes in your 2B, your supplier has not filed 3B, it's okay. But your supplier should file 3B by September 30th of the next financial year. That's a time limit given. 30th September of next financial year. Who? Your supplier. What? 3B should be filed. If your supplier has not filed 3B by 30th September of next financial year, then whatever ITC that is availed by the recipient, so should be reversed by 30th November of the next financial year. So there is a time limit of 2 months. September 30th, supplier not filed GSTR 3B. As a recipient, what we should do? Already we took the ITC. So that we need to reverse. So why you need to reverse? It is a mistake of the supplier, na? Yes, it is a mistake of the supplier only. But you already availed the ITC, na? So that's why you reverse. So then, sir, what if I have not availed the ITC at all? No problem. So you just check whenever September 30th of next financial year, you wait till that time. And if your supplier has filed GSTR 3B, then you take the ITC, because anyhow for taking ITC there is a time limit, na? 30th November of succeeding financial year or date of filing and return, whichever is earlier. As you are taking the ITC before your supplier is filing GSTR 3B, it's like a penalty on you for the purpose of availing the ITC early itself. Okay. So therefore you reverse the ITC. Interest? No. That's an amendment. No. If you are reversing by November 30th, if you are reversing by November 30th, so we will not punish you. You reverse the ITC, but don't pay any interest. However, if you are not reversing by November 30th of next financial year, you need to pay interest. Who you are? You are means recipient. Recipient should reverse the ITC by 30th November. Otherwise, recipient should pay interest at what rate? 18% per annum. From when? From the date of utilization, not availment. From the date of utilization till the date of reversal. If not reversed by November 30th of next financial year, interest at 18% shall be payable from the date of utilization till the actual date of reversal or payment. Now, here, suppose if the 3B is filed after September 30th of next financial year, then what will happen? Then simple, whatever ITC that has been reversed earlier can be re-availed without any time limit. So the time limit is not applicable. Just now I told you there is a time limit for availment of ITC, that is 30th November of the succeeding financial year or date of filing and return, whichever is earlier. But for re-availment of ITC reversed earlier, there is no time limit. We can take any time. But interest we cannot avail. Gone. That is gone. That is the income to the government. You understood? So why they create these provisions and all? Mainly for the sake of interest income. You understood or not? So this interest income is there. Sir, interest gone, sir. Suppose you don't want to pay interest, ensure that you are reversing by November 30th. And here, interest from the date of utilization. What is the meaning of date of utilization? When is it called as ITC utilized? That month in which the balance in ITC falls below the availed ITC. I have availed 1 lakh and I maintain the balance of 1 lakh every month. I have not utilized the ITC. In any 1 month, If my balance in ITC falls below 1 lakh, to that extent I have utilized ITC in that month. Okay. So that is the meaning of date of utilization till the date of reversal or payment. This is about Rule 37A, Section 41. This is also very important. So mainly on this interest computation can be tested. Here one interest computation is possible. So this interest computation related question could be tested. Then next, Section 49 we are discussing. 49 talks about the manner of utilization, 49 subsection 5. So far we have been talking about availment of ITC. We availed, we took the credit. Now we need to use it. Use it for what purpose? Use it for payment of our liability. And for that we have certain principles. The first principle says that there is no restriction with respect to IGST. Means what? IGST credit can be utilized for payment of any GST liability, and any GST credit can be utilized for payment of IGST liability. There is no restriction with respect to IGST. And amongst the other taxes, what are the other credits? CGST, SGST and UTGST. Respective credits can be utilized for payment of respective liability, and cross utilization is not possible. So if I have CGST credit, I cannot use it for payment of SGST liability. CGST credit cannot be used for UTGST liability. That is the meaning of this. So what is the first principle? IGST, no restriction. Between the other three credits, respective credit for payment of respective liability. And then second principle, order or priority. I have IGST credit. First I should use it for payment of IGST liability. Thereafter, whatever balance that I have, I can use it for payment of CGST, SGST or UTGST in any manner and in any proportion. Then what about the other credits? CGST credit first for CGST, SGST credit first for SGST, UTGST credit first for UTGST, then the balance if any for payment of IGST. Got it? Then third principle, before utilizing CGST credit, SGST credit, ensure that the IGST credit is exhausted. The first credit that we need to spend is IGST credit. Why, sir? Because of this reason. That is, IGST credit will be in a suspense account. So we should spend it properly for either CGST, SGST. So they will dispose it off to the respective government. So that's why they wanted us to spend IGST credit first before touching CGST, SGST credit. And principle number 4, that is, I have all the credits but only one liability, that is IGST liability. First to use IGST credit as usual for payment of IGST liability. Then which credit we should spend? CGST, and thereafter SGST or UTGST credit. Now, while doing this set off, so multiple answers are possible, but you should be careful as to the manner of utilization. So the minimum cash outflow should be the objective. So what is that minimum cash outflow objective? For example, I have CGST, SGST and IGST. So gross liability, gross GST payable is somewhere like 5,000, 5,000 and 5,000, and I have an ITC of 2,500, 2,000, ITC of 2,000, 2,000 and 10,000. Now in this case, what is the answer? See, 10,000 rupees I can use first for payment of 5,000. First I should use it for payment of 5,000. Still I have some 5,000. I should use it for payment of either SGST or CGST or both SGST and CGST. Suppose if I use entirely for SGST, let's see what happens. So that the SGST will become 0 and CGST 5,000 minus 2,000, 3,000 will be there, and this SGST is 0, IGST is 0. So there is this 2,000 carried forward, because 2,000 SGST credit cannot be set off with CGST liability. You got it? Because cross utilization not possible. Due to that reason, so this answer 3,000 is not the correct answer. Why it's not the correct answer? Simple. You see the total of the gross liability. What is the total of the gross liability? 15,000. What is the total of the ITC? 10,000. So 15,000 minus 14,000, 15 minus 14, 1,000 rupees should be the answer. So first check that. See, total gross minus total ITC. So the net should be 1000. So this is only the correct answer. You do anything, but ensure that you are getting 1000 rupees. Okay. So what is it you need to do for this? First, gross GST payable. So gross GST payable will be 5000, 5000 and 5000. So this total will be 10,000. And now minus IGST credit. So first we need to utilize IGST credit. That's what the principle says. First IGST credit should be utilized. So therefore 5000 I will utilize for payment of IGST liability. Then I will not spend more than 3000 for CGST. Why not more than 3000 for CGST? Because already CGST credit we have. So the better alternative is distribute it equally. Distribute it equally because the credit is also equal. If you see the credit 2000, 2000 and liability also 5000, 5000, if you distribute in that 2500, 2500, then minus CGST and SGST credit. So that will be like 2000 and 2000. So now what will happen if you see 500, 500, 0, so then. So actually the answer should be 1000. That should be the net GST payable. So here the answer is 1000 only. Alternative answers possible. So we can have 0, 1000, 0 or 1000, 0, 0 also alternative answers possible. But you do the total column. You do the total column and keep it like this. So that what will happen, you know, when you are doing the answers. So 10,000 and 4,000. So this will be coming to 1000. Okay. That is with respect to this. IGST credit after utilizing for payment of IGST liability can be used for payment of CGST, SGST, UTGST liability in any proportion. So multiple answers possible in the exam. So depending upon CGST, SGST liability, you apportion it. Okay. Then, sir, can GST compensations also be taken as credit? Yes, it can be taken as credit, but it should be utilized only for payment of GST compensations on outward supplies. Can it be used for payment of IGST, etc. and all? No. GST compensations is only for payment of GST compensations. Then, next one, section 16, conditions for availment of ITC. So, what are the various conditions for availment of ITC? Total 8 conditions we have. Condition number 1, only a registered person can avail ITC. Of course, unregistered person cannot avail ITC. So, because you know he cannot adjust, he don't have a liability now. So, what is the point in taking ITC? Number 2, inward supplies should be used or intended to be used. Used means used for the existing. Okay. So, used now, present. Intended to be used, purchase now, which will be used in future. So, even though not put to use, even though not ready to use, we can enjoy the ITC. Because if you use now, these words, put to use is there in income tax. Correct? Put to use. Only if you put to use, you can claim depreciation. And in India's we have ready to use. Till the time it is ready to use, all the cost you add it to the asset. Correct? But we don't have any use any use of this. Intended to be used also you enjoy the ITC. So to be used or intended to be used in the course means for the existing business. Furtherance for something which we are going to start in future we can take. So only a registered person can avail ITC. Inward supply should be used or intended to be used in the course or furtherance of business. Third condition, the person who is availing ITC should be in possession of tax paid document. So what is the meaning of a tax paid document? Either tax invoice or debit note or ISD invoice, input service distributor invoice or bill of entry. These are the 4 tax paid documents on the basis of which ITC can be availed. Possession, you should be having it. If the invoice is missing, we cannot enjoy the ITC. Even if you have availed, you reverse it. If you have not availed, don't avail it if the invoice is missing. So that is the meaning of possession. Then, fourth condition, recipient should have actually received the goods or services. This is what I was referring to. So invoice is pertaining to January. but the goods are received in February. When can we take ITC? January or February? Only February, because recipient should have actually received the goods or services. Supplier should have furnished the details of invoice in GSTR1, because if he is not adding the details in GSTR1, it will not come in 2B. If it is not coming in 2B, we cannot take ITC, because only self-assessed ITC can be taken. Correct? So therefore, supplier should have furnished the details in GSTR1. Supplier should have paid tax with respect to such supply by September 30th of the succeeding financial year. That's what we have seen section 41 read with rule 37A. What is that? Supplier should have reported the details in GSTR1 and should have filed the 3B by September 30th of next financial year. Recipient should have filed the returns, because how we can take ITC as a recipient? Without filing GSTR 3B we cannot take, because I have discussed this point. Availment of ITC, reversal of ITC, utilization of ITC, these three things happens in which place? Only in GSTR 3B. Without filing 3B we cannot avail ITC. And this is another point. GST paid on inward supply should be reflected in 2B under ITC available and should not be restricted. Why we have? Because there is one section, section 38. What does that section 38 says? Even though your supplier reports the details in GSTR1, but it will come in 2B under ITC not available. If it comes in 2B under ITC not available column, you cannot take ITC. There are many reasons which is given in section 38. As per section 38, in few cases, ITC shall be restricted in GSTR 2B. What are those few cases? Your supplier is a newly registered person. You purchased from him, so you should not purchase from him. So whenever you are making purchase from a supplier, you ask him, are you fresh? Yes, I will not buy from you, because he is a newly registered person. If you buy from him, even though he reports the details in GSTR1, it will come in your 2B under ITC not available. Where is it given? Section 38. Why they gave? Because they were drinking something while drafting this provision. So, see this. Refer page number 134. Refer page number 134 related to this section 38. So I have given it here. So what is that? Supplier is a newly registered business. So then, second, your supplier has filed GSTR1 but not 3B for some previous periods. Your supplier for some previous periods, he filed GSTR1 but not filed 3B. Okay. Now that would have been coming in GSTR1. So you have not done the reversal. You have to do the reversal now. If he is not filing 3B, as per section 41, you need to do reversal recipient. If you are not doing also, don't worry, they will put it under ITC not available in the subsequent months. Then next, your supplier liability in GSTR1 is greater than 3B. That idiot filed GSTR 3B. So section 41 read with rule 37A will not get retracted. When section 37, rule 37A will come. Section 41 read with rule 37A when it will come. If your supplier has not filed GSTR 3B by September 30th of next financial year, he filed, you understood, he filed, so this section and rule will not come. But another problem is there. What is that another problem? There is a difference in liability. When there is a difference in liability, rule 88C will get triggered on whom? On the supplier. As rule 88C get triggered, they will do the recovery from him. Okay, na sir, what is your problem? But in our 2B, it will come as ITC not available. That is this. Supplier liability in GSTR1 greater than liability in GSTR 3B. But remember, all these cases, the mistake is not done by the recipient. You are not doing anything wrong here. Your supplier is only doing anything wrong. Okay. For that only you are penalized. So why, sir? Next time onwards, don't buy from this supplier. He is a bad boy. Okay. That is the meaning here. Next, supplier ITC in 3B greater than his 2B. He has taken more ITC. Then your ITC is gone. Then supplier has received demand notices and default in payment of taxes, and such default continues. Who? Your supplier. He defaulted. And he has got the notices. How will I know, sir? You will not know all these things. You will know only when you are to be, you will see it in ITC not available. So this month you will be so happy. I have 10 lakhs ITC. So 12 lakhs is my liability. So 2 lakhs I have to pay. Like that we will be prepared. The moment you see 2B, you will get a mini heart stroke. Why? 10 lakhs you thought of ITC, but in that there is only 3 lakhs. What happened to 7 lakhs? It is moved to ITC not available. Then make a fund of 7 lakhs and make the payment. You understood? So why, sir? This because of these reasons. Any one reason. He might have got one notice. That and all you will not know. But only when you see in ITC 2B you will know. Supplier has received demand notice and default in payment of tax and default continues. Supplier defaulted in payment of 1% of his liability as per rule 86B. So I told you that there is one rule 86B which says that he has to pay 1% of his gross liability through cash ledger even though he has sufficient balance in his electronic credit ledger. If he is not doing that, who? Your supplier. Then you purchased from that bad boy, so your ITC is gone. So these are the 6 cases where ITC will be restricted in 2B as ITC not available. What are the 6 cases? Mark it as important for short note. 6 cases. Supplier is a newly registered business. Supplier filed GSTR1 not filed 3B. Supplier liability in GSTR1 greater than liability in GSTR 3B. Supplier ITC in GSTR 3B greater than his 2B. Then supplier has defaulted in payment of tax and the default continues, and supplier has to pay 1% of his liability through cash ledger, but he did not pay. So in these 6 cases ITC will come, but it will come under ITC not available. So first challenge of coming into 2B is what? He should have filed GSTR1. There are like multiple hurdles. Like while racing there will be hurdle match, we have to jump and go like that, multiple hurdles. What is the first hurdle? He is not reporting in GSTR1, but or he reported in GSTR1 but he did not enter properly, because of which it will not come in our 2B itself. That's the first hurdle. 2B it came, but we cannot take because of this. 2B it came, he reported in GSTR1 properly, it came, but we cannot take. Why? Again, supplier is newly registered or he has got demand notice, etc. Because of this reason. Then another twist is there. It came in 2B, we availed it. You understood? It came in 2B and we availed it. But that idiot did not file GSTR 3B by September 30th. So we need to reverse the ITC. You got it here? Understood? Okay, sir. We reverse it. Where is it given? Section 41 read with rule 37A. All these things we escaped. Finally, it came in our electronic credit ledger. We availed the ITC. Again, one rule is there, rule 86A, which says that whatever ITC that you have already availed in your electronic credit ledger will be suspended for a period of, like 1 year. Okay. So why, sir? There are some reasons that they have given. And 86B says, even though you have availed the ITC, but fully you cannot use, 99% only we can use. Okay. Connecting all these points. So I will tell you later. So what are the connections, interconnections between this? But try to keep in touch with this. Now, this is about section 38. So what are the 8 conditions for availment of ITC? The person availing ITC should be a registered person. The inward supply should be used or intended to be used in the course or furtherance of business. And these are the 2 basic conditions. Then in the 6 conditions, 3 conditions in the hands of recipient. What are the 3 conditions? As a recipient, you should be in possession of tax paid document, and you should have actually received the goods or services, and you should have filed your 3B to take the ITC. Then 3 conditions not in your hands, your supplier hands. What is that? Your supplier should have reported in GSTR1 and he should have filed the GSTR 3B by September 30th of next financial year, and he should not have contravened anything as per section 38, because if he does any contravention as per section 38, it will come under ITC not available to us. Then what is the meaning of input tax? Input tax refers to central tax, state tax, union territory tax charged on supply of goods or service or both made to a registered person. Okay, everything we can take as input tax, but it also includes tax paid on reverse charge basis. So whatever GST that we pay under RCM can also be taken as ITC. Even IGST charged on import of goods, that is also literally RCM only. So importer will pay along with customs duty IGST. Can basic customs duty be taken as credit? No. Can social fare surcharge be taken as credit? No. Only IGST on import of goods can be taken as credit. It does not include tax paid under composition scheme. Properly, like this person opting for composition scheme should not first of all charge GST to us. So there are two disadvantages for a person opting for composition scheme. Number one, he cannot take ITC on his inward supplies, and he should not charge the composite tax to his recipient. So now you are making purchase from a person opting for composition scheme. He should not charge composite tax to you, but he charged composite tax to you. Can you take ITC? No, because the meaning of input tax excludes, so tax under composition levy. Then what are the contents of invoice for availment of ITC? So there should be some minimum little bit details that should be there in a document to be called as an invoice for availment of ITC. What are those details? So first it should be having GSTN of supplier and GSTN of recipient. Number 2, it should have the description. Number 3, it should have value. And number 4, tax. And number 5, place of supply if it is interstate supply. These are the minimum details that should be present in a document to be called as an invoice for availing ITC. Then what is the meaning of inward supplies? Inward supplies means inputs, input service or capital goods. Inputs means those goods which are purchased and charged to P&L is known as inputs. If it is capitalized, then it will be called as capital goods. And input service means any service received will be coming under input services. Then deemed delivery. So that is like, in this case, one condition is the recipient should have actually received the goods or services. What if the recipient has not received the goods or service? On behalf of the recipient, some other third person has received the goods or services. That is bill to ship to transaction. There is a supplier. I am the billing address. You are the shipping address. Now the goods are delivered to you, but invoice is raised to me. I cannot take ITC because I have not received the goods. One of the conditions says that I should have received the goods. But there is a deeming fiction which says that the day on which the shipping address has received the goods or services, it is deemed that the billing address has received the goods or service and the billing address can take ITC. So it is not only for goods but also for services. For service also this will be applicable. When goods are delivered to any person or service are provided to any person on the instruction of the recipient, that is billing address, whomsoever is having the invoice, okay. The date on which such person has received the goods or service, such person has received the goods or service means the shipping address, the third person has received the goods or services. It is deemed that the recipient has received the goods or services and the recipient can take ITC. So in case of bill to ship to transaction, billing address can take ITC. The next point, if the goods are received in lots or installments, so against a single invoice, if the goods are received in 3 lots in 3 months, when can we take ITC against that invoice? Proportionately or on receipt of last lot? On receipt of last lot or last installment. Then reversal of ITC for non-payment of consideration to the supplier. So there is one proviso which says that as a recipient, this is given in rule 37, not 37A. Rule 37A is related to this. This is rule 37A. Okay, supplier not file GSTR 3B by September 30th, that is rule 37A. Which I am talking now is about rule 37. This is rule 37. Rule 37. So if the recipient has not made payment to supplier, what is that payment? Both value plus tax is not paid to supplier within 180 days from the date of invoice. So I am the supplier, you are my recipient. You have not made payment to me. Within what time? 180 days from the date of invoice. Now whatever ITC that you have already availed, because payment to supplier is not a condition for availment of ITC. In that 8 conditions, nowhere we have a condition that the recipient should make payment to the supplier. Even though recipient has not made payment to supplier, recipient can avail the ITC. So as a recipient, you avail the ITC, but you have not made payment to me within 180 days. Now whatever ITC that you have already availed needs to be reversed along with interest at the rate of 18%. From when? From the date of utilization till the date of reversal. This 180 days should be counted from when? From the date of invoice. from the date of invoice. So now you need to reverse the ITC along with interest. Now what if you make payment to me after 180 days? So much of the payment that you have made after 180 days, you can avail the ITC back. First you have availed ITC. As you have not made payment to me within 180 days, you reverse the ITC. Again you make payment to me after 180 days, you can avail it back. But the interest is loss. Okay. There are two places where we have reversal and re-availment. One under Rule 37A, which we have seen. Section 41 read with Rule 37A. What is that? Supplier not filed GSTR 3B by September 30th of the next financial year. Recipient will reverse the ITC and again it can be re-availed. Whereas another is Section 16 read with Rule 37. Section 16 says that if the recipient is not making payment to supplier within 180 days from the date of invoice, so much of the ITC availed by the recipient needs to be reversed along with interest, and again as and when the payment is made to supplier, recipient can re-avail the ITC. In both these cases of re-availment, there is no time limit, and in both these cases interest will be payable at the rate of 18%. From when? From the date of utilization till the date of reversal. And in both these cases, interest cannot be re-availed, only ITC reversed can be re-availed. So that is this. If recipient has not made payment to supplier within 180 days from the date of invoice, so much of the ITC proportionate to the amount not paid to the supplier shall be reversed along with interest, 18% per annum from the first date after date of utilization till the date of reversal. However, interest not payable if availed ITC is not utilized. Correct. So I have availed the ITC but I have not utilized at all, then interest payment shall not arise. But this 180 days condition has got exceptions. So three cases this 180 days condition is not applicable. Number one, supplies covered under RCM 9 subsection 3. So in case of 9 subsection 3, the liability to pay GST is on recipient. So therefore 180 days condition not applicable there. Then 7(1)(c), supply without consideration. Consideration itself is not there. From recipient will make payment to supplier. Then payment to third party on behalf of supplier under 15(2)(b). That is as per 15(2)(b), a recipient instead of making payment to the supplier, so any amount that the supplier is liable to pay to a third person, recipient will make payment. So any amount that the supplier is liable to pay is incurred by the recipient on behalf of the supplier. Means indirectly the payment is received by the supplier na. So due to that reason this 180 days condition is not applicable in this case. So these are the 3 points. And now what happens if the proportionate amount is paid? For example, so it's 60% paid within 180 days and 40% not paid. Now how much you need to reverse? 40% related ITC you should reverse, because you paid 60% within 180 days, that component you don't have to reverse. So you have not paid how much? 40%, that component only you need to reverse. And again say 100% you did not pay, so 100% you reverse. Thereafter after 180 days you paid 55%, how much you can avail it back? That 55% related ITC proportionate component only you can avail it back. So ITC proportionate to the amount not paid to the supplier, proportionate to the amount not paid to the supplier. ITC can be re-availed as and when payment is made to supplier after 180 days, but interest paid cannot be availed as ITC because there is no time limit for re-availment, but interest gone. ITC we can re-avail even if it is pertaining to some 2 years, 3 years before also. Then in case of depreciation under Income Tax Act, section 16 subsection 3, what does it say? Suppose if I follow the block of assets method, and in that block of assets method, if I add the asset value along with GST, then I would have already claimed the depreciation under Income Tax Act. So which means I should not avail the ITC here. Suppose if I added in the block of asset only the asset value excluding GST component, then the GST component can be taken as ITC, because you cannot have the double benefit. So if you cannot like enjoy the depreciation also there, and you cannot enjoy the ITC here, because depreciation leads to reduction in income tax. Due to that reason this cross provision has been created. For example, you purchase a capital goods for 10 lakhs and GST is 1,20,000. So if the depreciation is computed on 11,20,000, that is 10 lakhs plus 1,20,000, then ITC with respect to 1,20,000 is not available. You got it? Then because we are computing depreciation on 11,20,000. What if depreciation is computed on only 10 lakhs? Then ITC of 1,20,000 will be available, and we are talking about depreciation under accounting or depreciation under Income Tax Act. Here they gave depreciation under Income Tax Act, but as per Ind AS also the logic is same. there is no difference in that. But here while discussing they gave only under Income Tax Act. But the similar provision is there in India is also. Recoverable taxes should not be forming part of the asset. So I think in India is 10 PPE. So this point is there. So where they are telling that recoverable taxes should not form part of the asset value. Okay. Then time limit for availment of ITC. So 30th November of next year or date of filing I am written whichever is earlier. But what is the exception to this? Reavailment of ITC reversed earlier. And in case of debit note, so whenever we have a debit note, don't see its invoice date for determining the time limit, you see the debit note date only. For example, debit note date is 28th January 2023. For which financial year the debit note is given? 22-23. So based on that only you determine the time limit for availment of ITC. Don't see the invoice pertaining to this debit note. So you interpret the debit note independently. In case of debit note, availment of ITC depends on the debit note date, but not the date of invoice related to such debit note. So this is about section 16. Then section 17 talks about apportionment of credit and blocked credits. So apportionment of credit says that if I have some inward supplies which are used for taxable outward supplies, I can enjoy the ITC, no issue. If I have some inward supplies which are used for exempted outward supplies, can I take ITC? No. Again I am repeating, inward supply used for taxable outward supply, can I enjoy ITC? Yes. Inward supply used for exempted outward supply, can I enjoy the ITC? No. Inward supply used partly for taxable and partly for exempted, can I take ITC? Yes. Proportionate ITC I can take, same way. Inward supply used for business purpose, can I take ITC? Yes. Inward supply used for non-business purpose, can I take ITC? No. Inward supply used partly for business and partly for non-business, can I take ITC? Yes. Proportionate ITC I can take, that is this. Inward supply used exclusively in taxable or business purpose, ITC available. Exclusive used for exempted or non-business, ITC not available. Used for both taxable and exempted or both business and non-business, proportionate ITC available. Now where the zero rated supply should be brought? Zero rated supply should be treated as taxable. So it should not be treated as exempted, because zero rated, even though the rate of GST, like the burden of GST will become zero. What are considered as zero rated supplies? Export of goods or services, supply of goods or services to SEZ is considered as zero rated. In case of zero rated, I have two options. What is the two options? Option number one, I will pay IGST and I will get that IGST as refund, which means the burden will become zero. Or I will not pay GST, I will sell it under bond or LUT, and whatever ITC that I have, that ITC I will get as a refund. So which means the burden will become zero, but even then it should be treated as taxable. Means when outward supply is zero rated, can I enjoy the ITC on inward supply? Yes. In this regard, one more point also remember. Basically when my outward supply is exempted, I cannot take ITC on inward supply. But the same product or service is exported or supplied to SEZ, it will become zero rated. When it becomes zero rated, I can enjoy the ITC. Okay. So say this, there is a product X. There is a product X and that product X is exempted. Product X is exempted. And as the product X is exempted, can I take ITC on inward supply? ITC not available on inward supplies, correct? Not available on inward supplies. Okay. Now this product X which is exempted, the product X which is exempted is being exported. Exported or supplied to SEZ, then it will become zero rated. As it becomes zero rated, whether ITC available on inward supplies? Yes. ITC available on inward supplies. Reason being the character changes. Previously product X was exempted, so ITC not available. But the moment it is exported or supplied to SEZ, the character of this product X is zero rated. So therefore we can take the ITC on inward supplies. So be careful with respect to this. So they will give a product is exempted and the inward supply used for that exempted product. but the product is exported. When the product is exported, we will think that ITC not available, but actually ITC is available because the character of that product is now not exempted, the character changed to 0 rated. So that is about this. So 0 rated supplies will be covered under taxable supply for the purpose of availment of ITC. Now, what is the meaning of exempted supplies? So because if inward supply is used for exempted, we cannot take ITC na, or inward supply used for taxable and exempted, we can take proportionate ITC. So what is the meaning of that exempted supplies? So supplies notified as exempted. So there are some exempted supplies as per the definition for payment of GST. What are they? Notified as exempted, nil rated and non-taxable. These three are exempted even for ITC also. So notified as exempted means what? From time to time government will be giving certain exemptions by way of notification, that is known as notified as exempted. Nil rated means the rate of GST is nil. Non-taxable means alcoholic liquor for human consumption and 5 petroleum products. What are the 5 petroleum products? Crude oil, petrol, diesel, aviation turbine fuel and natural gas. These 5 petroleum products. Okay. So these are the 3 exempted supplies even for payment of GST as well as for availment of ITC. Then supply covered under RCM. So my outward supply covered under RCM, actually it is taxable for payment of GST. I will not pay GST, my recipient will pay GST, but for me it will be treated as exempted for ITC purpose. If I have some inward supplies used in this outward supply, I cannot take ITC. For example, I am covered under RCM, say I am an advocate, and my outward supply is covered under RCM. Now, as I am not having the liability on my inward supplies, can I take ITC? No, I should not take ITC because for me it will be treated as exempted for ITC. Supplier of RCM supplies cannot take ITC, but recipient can take ITC. So now you are paying GST under RCM. That RCM liability can you take as ITC? Yes. Then sale of land, sale of building, sale of securities. Now one more point, supply of warehoused goods under customs. So these 4 transactions are excluded from supply. They are not treated as supply. Excluded from supply. What are the 4 activities excluded from supply? Sale of land, sale of building, sale of securities and supply of warehoused goods under customs. What is this warehoused goods under customs? Imported goods kept in the warehouse without payment of customs duty, and the document of title called as warehouse receipt is transferred to some other person. Now this particular transaction is not a supply for me. Why it is not a supply for me? Because the subsequent buyer is going to file the bill of entry and pay the customs duty. So for me it is not a supply, but for exempted supply under ITC definition it is added as exempted supply. So 4 activities not treated as supply but treated as exempted supply for ITC purpose. Sale of land, sale of building. Which building? Sale of building where entire consideration is received after obtaining completion certificate or first occupation, whichever is earlier. Sale of securities and sale of warehoused goods under customs. Now in case of sale of building and sale of land, what should be taken as the value? Value should be stamp duty value. So why for land, building and securities only we are talking about value, by why for not others? Because others are already supply, means it will have a valuation, but these activities are basically not a supply, so there won't be any value, so we need to take the value. So land and building you take the stamp duty value, but in case of securities we need to take 1% of the sale value of that securities. Sir, what about the supply of warehoused goods? Normal sale value or transaction value at which the goods are sold, that should be taken. So this is about the 8 points. So what are the 8 exempted supplies? First, notified as first three remember, these are basically exempted for payment of GST even for ITC purpose. Notified as exempted, nil rated, non-taxable. Then supply covered under RCM. Then 4 points you remember which are not a supply but treated as exempted. So sale of land, sale of building where entire consideration received after obtaining completion certificate or first occupation, whichever is earlier, and sale of securities, supply of warehoused goods under customs. Then you remember this, even though interest on loans, advances, deposits is exempted, but it will not be treated as exempted while computing the exempted turnover for ITC, means it will be treated as taxable. it will not be kept under exempted, it will be treated as taxable. Which one? Interest on loans, advances, deposits, in so far as the consideration is represented by way of interest or discount, but this is except in case of banking company, financial institution or NBFC. It's like these 4 transactions are not a supply but treated as exempted supply, because of which what will happen? Our ITC balance will come down. How our ITC balance will come down? Say this, I have a common input tax credit. So the common ITC is 1,50,000. This is the common ITC, and I have some exempted supplies. So or exempted turnover. Exempted turnover is somewhere like 10 lakhs, and taxable turnover is 15 lakhs. Now how much is the net eligible ITC? How much is net eligible ITC? How to compute this net eligible ITC? First we need to take ITC availed. What is the ITC availed? Full ITC we will avail. 1,50,000 we will avail as ITC in 3B. Thereafter proportionate to exempted we need to reverse. So first you take the entire ITC, then proportionate reversal based on exempted. So what is that proportionate reversal? If you see 1,50,000 into exempted turnover divided by total turnover. Exempted turnover is what? 10 divided by total turnover, 10 plus 15, 25. So this is the proportionate ITC related to exempted that I need to reverse. First you take the full ITC and then reverse proportionate to exempted. So 1,50,000 into 10 by 25 is how much? 60,000 I need to reverse. So the balance is called as net eligible ITC. So the net eligible ITC is 1,50,000 minus 60,000, that is 90,000 is net eligible ITC. Now here what happens is that there is some sale of land. Okay. So continuation to above. Continue to above. Sale of land for 25 lakhs. Sale of land for 25 lakhs. Now what will happen to the net eligible ITC? ITC availed same, no change. So ITC availed in GSTR 3B is 1,50,000 minus proportionate reversal. So what is that proportionate reversal? Proportionate reversal, if you see, 1,50,000 into exempted divided by total. What is the exempted turnover? Already 10 lakhs we have now. Now this 25 lakhs will also be treated as exempted turnover, correct? Sale of land, even though sale of land, here 25 lakhs is stamp duty value. This 25 lakhs will be SDV, stamp duty value. So 25 lakhs even though not a supply, but treat it as exempted turnover. Now what will happen to the numerator exempted turnover? Already 10 plus 25, it will become 35 divided by, so now what is the total turnover? So 35 already exempted, taxable no change, 35 plus 15, that will be 50. So 1,50,000 into 35 divided by 50, please do the computation. How much? 1,05,000. Then what is the net eligible ITC? Net eligible ITC. Net eligible ITC is 40,000. Just 45,000. Okay. Just because there is some sale of land, so our ITC balance has fallen to 45,000 from 90,000. So this is only because of what? Sale of land. So because of bringing some not a supplies into exempted supplies, our ITC balance will come down. Same way, actually interest is exempted, because of which ITC should come down, but interest income is treated as taxable, and they are asking us to enjoy the ITC. Got it? Enjoy. Interest is actually exempted, but we are keeping it under taxable. Enjoy that ITC, celebrate the happiness. Okay, take dairy milk and celebrate the happiness. But sir, interest income will be this much only. Correct? What they have taken from us is this much. what they have given is this much. To whom interest will be this much? For them this is not applicable. Okay, this provision is not applicable for them. We will not, when we give we know how much to give. So to whom really they need to give, they have not given there. Service by way of accepting deposits, extending loans or advances in so far as a consideration is represented by way of interest or discount, except in case of banking company or financial institution or NBFC. Then one more point also I just wanted to highlight here, that is that I have given in a different place, you can write here itself. Even sale of duty credit scrips, sale of duty credit scrips also should not be treated, actually it is exempted, but it should be treated as taxable. Okay, so this supplies notified as exempted other than interest on loans, then other than interest on loans or sale of duty credit scrips, sale of duty credit scrips. Duty credit scrips means, so we will get under foreign trade policy some duty credit scrips which can be adjusted against our customs duty liability. Either you can adjust against a customs duty liability or you can transfer the duty credit scrips to some other person. Now when you sell the duty credit scrips, so we have a concept of electronic duty credit ledger in customs. As per that electronic duty credit ledger, whatever incentives that we are getting from the government, instead of giving to us in our bank account, they will put it under electronic duty credit ledger. This amount, whatever is there in duty credit ledger, will be given as a scrip amount. So scrip number, this much amount will be the duty credit. So now what I can do with this duty credit? I can adjust with my customs duty liability. What if I don't have the customs duty liability? I will sell this duty credit scrips to some other importer. I can transfer it. When I sell this duty credit script to some other importer, I will receive some money now for this. I am selling means someone is buying now, I will get that money. So this particular transaction of sale of duty credit script is basically exempted. We don't have to pay any GST on that. But while determining the ITC, it will be treated as what turnover? It will be treated as taxable turnover. You understood? So that is the meaning of the sale of duty credit scrips. It will not be treated as exempted turnover. You understood? Then that is the meaning of this. So we'll take a break and thereafter we'll continue with this rule 42 and rule 43. That's a very important discussion. Okay, we'll start. So there is one query like sales at duty free shop. So just wanted to show you one amendment. So we have discussed about sale of warehoused goods under customs. That sale of warehoused goods under customs point only is this. So they are telling for the purpose of rule 42 and 43, the value of activities or transactions mentioned in paragraph 8A of schedule 3, which is required to be included in the value of exempted supplies. So this, rather than giving us sale of warehoused goods under customs, they gave it in a different way. That is supply of goods from duty free shops at arrival terminal in international airports to the incoming passengers. Basically what is that? So this duty free shops which is there in the international airports itself is like a warehouse. So in the international airports there will be something called as duty free shops. Those duty free shops should be treated like warehouses. So any goods which are imported and kept in that warehouse is actually not chargeable to any duty. Okay, that's what basically duty free shops. Whenever they are selling it to any person over there, they will not charge any duty or tax, etc. Means in a way it is like not a supply, because it will come under sale of warehoused goods under customs. But for the purpose of ITC, it will be treated as exempted. So in this point, sale of warehoused goods under customs to any person before a clearance for home consumption, it also includes sale of goods by a duty free shop by a duty-free shop in international airport. In international airport. So because this duty-free shop itself will be coming under warehouse for the purpose of customs. Okay, that is one point. Next, will questions be covered in this rocket revision? Why? Regular batch itself I will take in 4 days. How can I take care? Let me complete the revision first fully. Okay, I don't know whether that I can do in 4 days. Then, if any lawyer is getting service from any other RCM supplier, does the RCM supplier need to pay GST on FCM basis? No, not like that. For example, I am an advocate. My outward supply is covered under RCM. Okay. Now, I have some inward supplies on which I need to pay GST under RCM. It does not mean that, I will not pay. So, it's like I am exempted from registration. Why am I exempted from registration? A person who is making exclusively exempted supplies or exclusively RCM supplies is exempted from registration as per section 23 of CGST Act. So, in this case, there is an advocate. So, that advocate is providing outward supplies, and these outward supplies of advocate is covered under RCM. So, when it is covered under RCM, this advocate is exempted from registration. He is not required to get registered. So, exempted from registration under section 23. Now, advocate is making some import of services. Some inward supplies are there, and on that inward supplies, advocate is required to pay GST under RCM. Now, so every person who is liable to pay GST under RCM is compulsorily required to get registered. So, compulsory registration under section 24. Then, whether the advocate is required to register and pay GST? No. So, why advocate is not required to get registered? So, because not required to get registered. What is the reason behind this? Section 23 overrides section 24. So, when section 23 overrides section 24, so he is not required to get registered. Consequently, he will not be paying any GST. But don't change the character of the service. The character of the service is taxable only. It will be taxable under RCM. But only thing, GST will not be payable. Okay. Now, for advocate, first of all, he is not required to get registered. So, the question of ITC will not arise. Suppose if advocate is registered, then will he pay GST under RCM? Yes, he will pay GST under RCM if he is registered. Actually, he is not required to register. If he is registered, will he pay GST under RCM? Yes. But can he take ITC on his inward supplies? No. Why he cannot take ITC on his inward supplies? Because the outward supply is covered under RCM. When the outward supply is covered under RCM, it will be treated as exempted. So, ITC cannot be availed. So, that is the clarity here. Okay. Then, and some students are asking me to upload the amendments video also. This revision itself covers amendments as well. Wherever it is amendments, I am highlighting that as amendment and I am discussing in detail. So, separately I am not uploading, because if I need to upload amendments video, 50% of this revision video itself I have to upload. Okay, that I will try if required, but not required. This itself is sufficient. So, please attend the amendments video, not separately. This revision itself sufficient. Okay. So, I think these are your queries. Now, moving on to rule 42. What does rule 42 talks about? I have some inward supplies which are commonly used for taxable and exempted. What is the manner of availment and reversal of ITC? For the purpose of this rule 42, you need to follow a particular procedure. So, in this procedure, we need to know the meaning of certain terms. First, we need to know T. What does T refers to? T refers to total ITC, that is total GST paid on inward supplies. So, you can just put the numbers over there so that you will understand what it is about. The total GST paid on inward supplies is 4 lakhs. The total GST paid on inward supplies is 4 lakhs. And this 4 lakhs, we should segregate into 4. That is, Inward supplies used for non-business purpose. Inward supply is for non-business purpose. Can we take ITC? No. While discussing section 41 read with rule 37A, what is that we have seen? Self-assessed ITC, I told you. In that self-assessed ITC, what is the discussion I have been making? So, matched ITC, and three things, even though comes in 2B, we should not take. What are those three things? So, inward supplies which are used for non-business purpose, exempted supplies and blocked ITC we should not take, correct, even though it is coming in 2B. Say for example, non-business purpose is 50,000 and inward supply used for exempted supplies is 75,000 and inward supplies which are blocked credit is 25,000. Now this 50 plus 75 plus 25, can we take ITC or we cannot take ITC? We should not take ITC. Now based on this you tell me what is ITC availed in GSTR 3B. What is ITC availed in GSTR 3B? 4 lakhs minus 50,000 minus 75,000 minus 25,000. So therefore this will be 1,50,000 you take out. So 1,50,000 if you are taking out. So what is the remaining amount that is left? 2,50,000. This 2,50,000 is what? ITC availed. 2,50,000 is called as ITC availed. Okay. Understood up to this? What is the first step or first process? First T. T minus T1, T2, T3. What is T1, T2, T3? Non-business, exempted, blocked ITC. Remaining ITC we will take in 3B, 2,50,000. Now this 2,50,000 can we enjoy fully? No. Why we should not enjoy fully? Because this 2,50,000 we don't know fully used for taxable or what. So we cannot enjoy it. Okay, but we have availed it. We have availed it. Out of this 2,50,000, how much is used for taxable purpose? 2 lakhs. So can we enjoy this 2 lakhs fully? Yes. Yes. Now what is a common credit? What is a common credit? 50,000. How we got common credit? 2,50,000 minus 2 lakhs, which you could not segregate in these 4 places, is known as common credit. So the common credit is 50,000. This 50,000 we can arrive in 2 ways. Number 1, you take 4 lakhs. From 4 lakhs, you reduce everything. That is 50,000, 75,000, 25,000 and 2 lakhs. So the remaining is 50. Either you do this way or you take. So 2,50,000 is the ITC avail. From that ITC avail, you separate fully used for taxable, that is 2 lakhs. So the remaining is also common credit, 50,000 rupees. Now this common credit you cannot enjoy fully. So proportionate to exempted you need to reverse. So that's what we did in this question. So what we did is that first we have taken the ITC. After ITC avail, we reduce the proportionate reversal. Proportionate reversal, how we calculated? Common ITC into exempted by total. So common ITC into exempted by total we need to reduce. Say for example, so common ITC is 50,000 into exempted turnover is 10 lakhs and the total turnover is 25 lakhs. This is what we have taken. So 10 divided by 25. How much is the ITC that we will reverse? 50,000 into 10 divided by 25. 50,000 into 10 divided by 25. How much? 20,000 we need to reduce. So means this 20,000 we cannot enjoy as ITC. Then common credit with respect to non-business purpose. So 50,000 into 5%. So that will be how much? 2,500. So 2,500 we need to reduce. Now this is what we need to do. So remember, first we need to take T. T refers to total ITC on inward supplies. It is total GST paid on inward supplies minus T1, T2, T3. T1 non-business, T2 exempted, T3 blocked. These 3 we should not take. These 3 we should not take. So how much we should take in the GSTR 3B? ITC availed in GSTR 3B 2,50,000. So 2,50,000 is the ITC availed in GSTR 3B. Now after availing this, now you need to do the computation of common ITC. How we will get the common ITC? From this ITC avail you take out exclusive list for taxable and business purpose, that is 2 lakhs if you take out. So remaining 50,000 is the common ITC. This 50,000 proportionate to exempted. So into 10 divided by 25. What is this 10 and 25? 10 is exempted turnover, 25 is total turnover, that you need to check in the question. Okay. then we will be getting 20,000. Then the common ITC attributable to non-business purpose, because if you are using partly for business and partly for non-business, you can take proportionate ITC. So non-business purpose is 5%. So 2,500. Now how much we need to reduce from the availed ITC? How much we need to reduce? 22,500 we need to reduce. So 2,50,000 minus 22,500. What is the balance that will be net eligible ITC for set off? 2,22,000, 27,500 will be the net eligible ITC for set off. So this is how we need to arrive at the answer. So you need to remember the format T, that is total GST paid on inward supplies. While reading the question itself, you put T1, T2, T3, T4 properly. In the solved workbook already I have given few questions related to that along with the QR code. So you try that questions. Okay. So first you need to take T. T is total GST paid on inward supplies minus T1, that is inward supply used for non-business, minus T2 inward supply used for exempted, minus T3 blocked ITC. The balance is known as C1. What is C1? ITC availed in GSTR 3B, minus T4 fully used for taxable purpose, that is 2 lakhs in this case. So 2,50,000 minus 2 lakhs, common ITC 50,000. Next we have D1, common ITC attributable to exempted, that is C2 common credit into E by F, exempted divided by total. Then common credit attributable to non-business purpose, C2 into 5%. Okay, but why sir 5% only? Because you don't know how much is exactly used for business and how much is for non-business. If you know exactly how much is business, how much is non-business, that you will divide in the T1, T4 stage itself. For example, 1/3 non-business, 2/3 business, means 1/3 you will put in non-business T1 and 2/3 you will put it in T4. So it will not come in common credit. If it is not coming in common credit itself, you don't do into 5%. Okay, and here 5% of the total common credit. If we have 10 invoices in the common credit, in the 10 invoices, only one invoice is used for partly business, partly non-business, but all these 10 invoices into 5% we need to do. So it is not only that particular purchase or inward supply used for business and non-business, we need to multiply 5%. Total common credit we need to multiply 5%. Why is it so, sir? Because that is a ad hoc assumption that we are taking. If you don't want that 5% to happen, then you ascertain how much is used for business and non-business, that you segregate in the beginning stage itself, that is T1 and T4 stage itself. So this is how you need to arrive at the answer. Then here C3 will be computed separately for CGST, SGST, means this computation whenever in exam you do it separately for CGST, SGST and IGST, and then this computation majorly this is our focus, D1 and D2. So this is the ITC away, this is the ITC reverse. So this D1 and D2, so we will do on month, every month we will do this computation. Again at the end of the financial year, we need to do this computation once again, and we need to compare it between month on month versus D1 and D2 compute at the end of the year. Say this, D1 and D2 compute for the whole year by taking exempted turnover and aggregate turnover for the whole year. For example, D1 and D2 that we have computed month on month. So that is called as provisional D1 and D2. Say the provisional D1 and D2 which is computed every month. So the total is 15 lakhs. And final D1 and D2. This final D1 and D2 that we are computing at the end of the financial year is say 12 lakhs. Means how much we have reversed? This 15 lakhs is already reversed. This 15 lakhs is already reversed. Whereas this 12 lakhs is to be reversed. This 12 lakhs is to be reversed. Now already reversed 15 lakhs. But actually you need to reverse only 12 lakhs. What is the excess reversed? Excess reversed is 3 lakhs, and this 3 lakhs can be availed as ITC. You understood? Availed as ITC. And when we will do this computation, say this computation we will do from April 2023 to March 2024, we do provisional D1, D2. Every month we will do. Whereas this final D1 and D2 is there na, this final D1 and D2 we do it by 31st March 2024. At the end of the year we will do. and the excess reverse we will arrive, and that excess reverse we will avail as ITC by 30th September, not November. Usually the time limit for availment of ITC is 30th November of the next financial year, but in this case it is 30th September of next financial year, that is 2024. By 30th September 2024 we should avail this ITC, not return of September, any return, but that return should have been filed by 30th September of the next financial year. So because what happens is that in MCQ we will think time limit for availment of ITC 30th November, they will give 30th September, 30th November, 31st October and some other date. We will think time limit is 30th November only and we will select 30th November, but in this place it is not 30th November, it is 30th September. Okay, say this. D1 and D2 will be computed for the whole year by taking exempted turnover and aggregate turnover for the whole year. If this amount is more than the amount already added, so actually we have seen the next point. If this amount is less than the amount added to output tax liability every month, the additional amount has to be claimed back as credit in the return of any month till September of the succeeding financial year. Then next, suppose if it is like reverse, what if the provisional amount, the provisional D1 and D2, the provisional D1 plus D2 is say 15 lakhs. This 15 lakhs is already reversed, whereas the final D1 and D2, this final D1 and D2, that will be like say 18 lakhs, this is to be reversed, So this computation we are doing from April 2023 to March 2024. And this computation we will do by 31st March 2024. And now what is the shortfall? Shortfall in reversal. Shortfall in reversal is 3 lakhs. Okay. And this 3 lakh shortfall in reversal we need to reverse. Why we need to reverse? Actually we should have reversed 18 lakhs, but how much we already reversed is 15 lakhs. So the 3 lakhs should be reversed. By when? So it should be reversed by September of the succeeding financial year, same date. It should be reversed by 30th September 2024, but here along with interest. When we reversed excess, we will not get interest and all. Don't expect interest from government. So you are getting this ITC itself, that itself is greater. But when there is a shortfall, you need to pay along with interest. At the rate of 18% per annum from 1st April 2024, because we should do this computation by when? March. So they are asking us to do the interest computation from 1st April 2024 till the date of reversal. And in many places they use the word reversal or payment interchangeably, both are same. If you have balance in ITC, you will reverse. If you don't have balance in ITC, you will make the payment. Okay. So that is this. So here what they are telling you, see. So if the amount already added to output tax liability, if this amount is more than the amount already added to output tax liability, so we need to do it till September of succeeding financial year along with interest at 18% from 1st April of succeeding financial year till the date of payment. Again here we need to do reversal by September. What if we are not doing it by September? Then recovery will be made. So in this case, if you are not availing ITC by 30th September, it will be lapsed. Whereas in the second case, second example what we have discussed, if you are not reversing by 30th September, what will happen? They will initiate recovery. When they initiate recovery, even they will levy the penalty also. Okay, that is with respect to this. Then this is about rule 42. Then rule 43. Is it necessary to remember all the sections? Not required, but I don't know what is your objective. Your objective is 40 marks, not required. If your objective is 40 marks, really not required. So just this revision lectures will help you. You don't have to remember any section number or rule number, etc. and all. Just happily go to the exam. You will definitely get 40, 45, etc. and all. So you don't have to remember. But what is your objective? Depending upon that objective, it will be. So no student will read indirect taxes with the objective of 40 to 45. So because there are other subjects as well, so called as DT and IBS, etc. and all, and which are not actually bankable subjects and all. So due to that reason, IDT, if you are targeting 80 plus only, so you will be on a safer side, so that aggregate problem will not happen. For that reason only, even though it is a throat pain for me, I am repeating it 1000 times, so the same point, okay. So like by mistake that number may come in the exam and you will write it, okay. So say this, rule 43. Rule 42 is the manner of availment in case of inputs and input services. So this is a process you need to follow. Just because my name is THARUN'S, I did not keep T and all. Law itself they gave T, I did not keep, okay, because one student messaged me, why sir T, because your name is THARUN'S, or also you can give na. Arey yaar, this T, T1, T2 I did not give here, it's a coincidence my name matches here, you understood. So but actually this is given in the law itself. So even in exam also you should write this only, T, T1, T2, T3. Then rule 43, manner of availment of ITC with respect to capital goods. What does it say? So I have capital goods which is used for taxable or business purpose. Can I enjoy ITC on this capital goods? Yes, no restriction, we can enjoy it because it is used for taxable and business purpose. Okay, I have some capital goods which are purchased and used for exempted or non-business purpose. Can I take ITC on this capital goods? No, you should not take ITC on this capital goods because your outward supply is exempted or non-business. Okay, I have purchased some capital goods which is partly used for taxable or business and partly for exempted or non-business. Can I take ITC? Yes. Take ITC, but conditions apply. This ITC is not enjoyable fully. So you have to reverse it over a period of next 60 months. For example, you purchase this capital goods, you can write the numbers over there, 10 lakhs excluding GST at 12%. So this is the value of the capital goods that you have purchased, 10 lakhs excluding GST at 12%. So what is the ITC? What is the ITC? 1,20,000 is the ITC. Now this 1,20,000 what you should do? Can you enjoy the ITC? Yes. Avail the ITC. 1,20,000 you avail ITC on the month of purchase itself. This month you purchase, this month itself you take the ITC. But you are using it for both taxable and exempted. So for the next 60 months, you need to do the reversal. So what is the monthly ITC? 1,20,000 divided by 60. So that will be how much? 2,000 rupees is the monthly ITC. Sir, should we take 60 only? That is usual assumption which is given in the law. The law says up to 60 months, which means you can take 48 months also, 36 months also, but go by the question. If the question says 36 months, you take 36 months. If the question says 48 months, you take 48 months. If there is no information in the question, you take 60 months. Okay. So 60 months should be taken standard as per the assumption. But if there is a lesser period given in the question also, you can take that lesser period. Otherwise, you take 60 months. So the monthly ITC will be 2,000 rupees. Now what you should do with this monthly ITC? You should reverse. Proportionate to what? Exempted to total. Exempted to total of that month, every month. Say for example, first month 2,000 into exempted turnover say 10 divided by total turnover say 25. So 2,000 into 10 by 25, how much? 300? 800. 800 rupees you need to reduce. 800 rupees you need to reduce from where? 1,20,000. 1,20,000 is the availed ITC na? Minus 800 rupees. That much only, sir. No, this for month 1. Like that we need to do for 60 months. Okay. And 800 rupees you need to compute interest. How much you reversed? 800. But this 800 is out of this 1,20,000 already availed. So you need to compute interest at what rate? 18%. From when? From the date of availment. Usually interest we need to compute from the date of utilization till the date of reversal or payment. Everywhere, correct? But in rule 43, we need to do it from the date of availment. Usually on account of interest in ITC, you should compute it from the date of utilization till the date of reversal. In this place alone, we need to do it from the date of availment till the date of reversal because it is specifically given in rule 43 like this. Due to that reason only we are doing this. So the above amount to be added to output tax liability for every month for the next 60 months along with interest at 18%. So this 800 into 18% into number of months. Number of months we have divided by 60. Number of months divided by 12. For example, if this is pertaining to third month, if it is pertaining to third month, first month you avail the ITC. So first month to second month to third month, that is 2 months we need to compute interest. Okay, means for 60th month, sir, 59 months we need to compute interest into 59 divided by 12, 18% per annum over the period. Date of availment first month, date of reversal is 60th month. So which means for 59 months we need to do the interest computation. Then this procedure is not applicable from when? During the 60 months, any 1 month the asset is sold, then the asset itself is not there. Why I should do the reversal? I don't have to do the reversal. Or the asset got converted into capital goods 1. The asset got converted into capital goods 1 means it is used only for taxable. So again don't do the reversal. Okay, that is what I have given note. The above procedure is not required from the month in which capital goods are sold. Why? Because GST anyhow you are paying under 18 subsection 6. So what is this 18 subsection 6? Whenever capital goods are purchased on which ITC has been availed and that capital goods are sold or disposed, now you need to apply 18.6. What does 18.6 says? GST payable will be highest of the following: A, ITC availed minus 5% depreciation for every quarter or part thereof. From when to when? From the date of purchase till the date of sale, or GST on sale value, whichever is higher. Anyhow I am going to pay the GST on this, which is higher of what? Unutilized ITC. How you got unutilized ITC? ITC availed minus 5% for every quarter. From when to when? Date of purchase till the date of sale. For example, you used for 2 years, boss. You used for 2 years and you are selling it. So let's see what will happen in this case. Say 1st April 2020 you purchase capital goods, and you purchase capital goods for 10 lakhs excluding GST at 12%. Okay. Now you are using it. What is the life of the capital goods? Life of the capital goods is what? 60 months or 5 years. So that is what? 31/3/2025. This is the life of the capital goods, correct? Now what happened somewhere after 2 years? So that is 31/3/2022. Okay. So you are selling the capital goods. Sale of capital goods. Sale of capital goods for 6 lakhs. 6 lakhs excluding GST at 12%. You tell me what would have happened in this case. And this is common capital goods. This is common capital goods. 1/4/2020 itself ITC availed, correct? How much is the ITC availed on 1/4/2020 itself? 1,20,000. Now from 1/4/2020 to 31/3/2022, how many months? 24 months, 2 years. What we would have done in these 2 years? So monthly reversal, correct? Monthly reversal. Now you are selling the capital goods. When you sell the capital goods, at this stage itself, GST payable under section 18 subsection 6. What is it? GST payable under 18 subsection 6? ITC avail minus 5% for every quarter or part thereof from the date of purchase till the date of disposal. That is 24 months means how many quarters? 8 quarters. 2 years here, 1 full 4 quarters here, 2 fulls means 8 quarters, correct or not? So 1,20,000 minus 8 quarters into 5%. Okay, how much that comes to? 8 5s are 40. 1,20,000 minus 40%. 72,000 or B. So what is the sale value of the capital goods? 6 lakhs into 12%, that is 72,000. So exactly it is the same. So I will just change here, instead of 6 lakhs. So CG, sale of capital goods for 6,50,000 excluding GST at 12%. So that will come to 78,000. So whichever is higher, not lower, 6 lakhs into 12%, sorry, 6,50,000 into 12%, 78,000, whichever is higher. So which is higher? That is 78,000 is the GST payable. So you are paying, actually 24 months you reverse, and here at this stage you are paying 78,000. You got it? Now for the remaining life, what is the remaining life? 36 months. For this 36 months, whether monthly reversal required or monthly reversal not required? Huh? Not required. Monthly reversal not required. Why monthly reversal not required? Because already you paid the GST here at the time of sale of this capital goods. You got it? So somehow my intuition says that this concept will be tested. So this concept might be tested. So in the forthcoming exam for May 24, because quite a long time they didn't touch on capital goods. On inputs and all they have been testing, but not on capital goods. So merging these two concepts, they can check a question on 18.6 as well as on monthly reversal. Then next, another point we will see. So look into the next below discussion. There are two situations, initial purchase CG1 and at a later point of time CG2, and another case is initial purchase CG3 and at a later point of time CG2. Okay, and here one query, whether we need to take this as calendar quarters or 3 months should be counted as 1 quarter, calendar quarters. Calendar quarters means what? So it's like any one day in that quarter, you should take it as a full quarter. For example, instead of 31/3/2022, if it is 4/4/2022, then automatically it will become 9 quarters. How it will become 9 quarters? In the next quarter, see, up to 31/3/2022, 8 quarters here, path thereof. Now in April few days came na, so that should also be counted as 1 quarter. You understood? So therefore be careful while doing the quarter computation. Everywhere, actually only one place there was a difference. Duty drawback alone, we should count 3 months as 1 quarter. Like say for example 15th January means, how we will count quarter is 15th January to 15th April, 1 quarter. Like that we used to count, where in duty drawback. But now duty drawback chapter is removed. So everywhere in GST and customs we have calendar concept only, calendar quarter only. So 15th January means it should 15th January to 15th April. How many quarters? 2 quarters. How 2 quarters? Jan, Feb, March 1 quarter, April few days are there, that will be counted as 1 quarter. Got it? So everywhere in GST and customs it will be calendar quarter only. Now, so look into this initial purchase CG1 and later point of time CG2. CG1 means what? It is used fully for taxable, and at a later point of time it is used for common. Now what will happen in this case? So the logic is simple, that is I purchase the capital goods. So on 1/4/2020, and the life of the capital goods is 31/3/2025. So the life is 5 years or 60 months. Now somewhere on 31/3/2022, that is 24 months, 24 months and 36 months. Initially I purchased it and used it for taxable. Okay, initially I purchased it and used it for taxable. So 10 lakhs is the worth of capital goods excluding GST at 12%, and it is used for taxable. Now what happened on 31/3/2022 is that I am not selling. In the previous example I took for sale. Now I am changing the situation. I am not selling, but I started using it for common. Used for taxable and exempted. Used for taxable and exempted. Now what will happen in this case? So 1/4/2020 itself, ITC availed or not availed? ITC availed. Why ITC availed? At that time we have purchased and used it for what purpose? Taxable. So we would have availed ITC at that time itself. How much is the ITC availed at that time? 1,20,000 itself we have taken ITC at that time. And for 24 months we are using it for taxable. Whether any reversal required for this 24 months? No. Reversal not required. Why reversal not required? Because you are using it only for taxable purpose. Now from 31/3/2022 till 31/3/2025 for 36 months, whether reversal required or not? Yes. Why reversal required? Because we are using it for both taxable and exempted. So monthly reversal required. Monthly reversal is required. And when you do the monthly reversal, how much we will take as ITC? So we will avail the ITC now. At the time already availed or not availed? Already availed. So whether we will avail the ITC? No, we will not avail any ITC. So at this stage, ITC not availed. Why ITC not availed? Because already we have taken in the beginning. Now don't take any ITC. Just consider as common ITC. 1,20,000, whatever is there, 1,20,000, consider as common ITC. Don't do anything else. Just consider it as common ITC. For the next 36 months, we will do the monthly reversal. That's it. Got it? So, initial purchase, we are using it for CG1, taxable. So, ITC already availed at the time of purchase. So, no need to avail common credit. No need to avail common credit. Just consider it as common credit. And what is the monthly ITC? Same, no change. Original ITC divided by 60 because the life of the capital goods cannot be more than 60 months. Now, proportionate reversal from the date of conversion for the balance useful life. So what is the balance useful life here? 36 months. For 36 months we need to do the reversal, monthly reversal required. Then another situation, initial purchase CG3 and at a later point of time CG2. Now same scenario, but there is a change here. What is that change? That is 1/4/2020. I purchased the capital goods. And the life of the capital goods is what? 31/3/2025. And I purchased capital goods for 10 lakhs, excluding GST at 12% and used only for exempted. And what will be the life of the capital goods? So 5 years. Now somewhere on 31/3/2022, that is for 24 months. Okay. After 24 months, I started using it for, used for both taxable and exempted. Used for both taxable and exempted. Now, you tell me whether ITC would have been availed at the time of purchase. No. Why not availed? Because it was used only for exempted. That's what we have seen. If capital goods are purchased and used only for exempted, we should not take ITC. So we have not taken ITC. Here ITC not availed. So ITC not availed at the time of purchase. But are we supposed to take the ITC now? Yes. Why we are supposed to take the ITC now? Because we have not taken at the time. Now you are using it for both taxable and exempted. So ITC availed. How much is the ITC that will be availed? 1,20,000. You avail now. But last 24 months you are using it for what? Exempted. Now can you enjoy the ITC for this period? This 1,20,000 you should have taken 1/4/2020, but you are taking it now. But this 1,20,000 contains the component of 24 months, yes or no? So this 24 months you used it for what? Exempted, which means you should not enjoy the ITC. So therefore ITC reversal, this is for the past period. For the past karma, we are reversing it now. You understood? So ITC reversal. How much is the ITC reversal? 1,20,000 into 5% into how many quarters? 8 quarters. So please do the calculation. 1,20,000 into 40%. That is 48,000. Now you are availing the ITC 1,20,000. Sir, should I avail 1,20,000 or I should avail 1,20,000 minus 48, 72,000. How much I should avail? Avail 1,20,000. Thereafter you reverse for the past period. You understood? And then you consider it as common ITC. Consider as common ITC and for the next 36 months, for the next 36 months, you need to do the monthly reversal. Monthly reversal required. Sir, why should I do, sir? This is for the future karma. You understood? Past sin, wipe off fully. Future sins, as and when you do, you wipe off. You understood? So, monthly reversal over the next 36 months. Last 24 months, now itself you reverse. Okay. So, 2 reversals will come. But in the previous situation, only 1 reversal. Why? Because for the past 24 months, you did only good deeds. You understood? You don't have to wipe off anything. So, full good deeds, taxable only you did. Only future you are going to commit some sins. For that only you need to do the reversal. You understood or not? But here, past also bad, future also bad. So, therefore, first clear the past fully. So, that is what 24 months you are fully reversing. Then for the remaining 36 months, month on month you do the reversal. You got it? That is about this. So, ITC not availed at the time of purchase. So, we are availing it now. What is that? Original GST paid. Ineligible ITC to be reversed. For the period it was used for exempted. Past. Used for exempted. How much? GST paid into 5% into number of quarters or part thereof from the date of purchase till the date of conversion. And monthly ITC, same, proportionate reversal for the balance life. So, this is about capital goods, 3 special cases. So, these 3 special cases can definitely be tested, possible. So, these are the 3 special cases. First special case we saw was that common capital goods at a later point of time we sold it. Next one, initial purchase for taxable and then used for common. Then initially purchased for exempted and used for common. These 3 can be tested for May 24, which is a very important area, untapped area, that is why. Then we are moving on to 17 subsection 4. 17.1 and 17.2 talks about proportionate ITC. 17.3 talks about the meaning of exempted supplies. Rule 42-43 talks about the manner of availment and reversal of ITC in case of inputs and input service. Rule 42, capital goods, Rule 43. Now, 17.4 talks about special provision for availment of ITC by a banking company and financial institution, including NBFC. Basically, for a bank, financial institution or NBFC, they will be having 2 incomes, 2 major incomes, that is interest income and other income. Interest income will be exempted income, no need to pay GST on that, and the other income will be taxable income. Why? Because any bank or financial institution or NBFC, interest on loans, advances and deposits other than interest involved in credit card is exempted. So, interest in credit card will be taxable, but interest on loans, advances, deposits will be exempted, and all other income for the bank will be taxable. We do not have any exemption like check collection charges, demand draft commission or NEFT charges, RTGS charges, debit card charges, like that every charges will be taxable. So, therefore, interest income exempted, other income will be taxable, which means bank cannot take full ITC. They can take only proportionate ITC because part of their outward supply is taxable and part of their outward supply is exempted. So, they have to do the proportionate computation. How they will do the proportionate computation? Total ITC into exempted turnover divided by total turnover. That is for inputs and input service. For capital goods, just now we discussed now Rule 43 that they need to follow. But bank, it is difficult for them to follow this Rule 42 and 43 because they have lot of documentation and administration work. For them, they have been given one special option that is called as ad hoc ITC option. Under that ad hoc ITC option, flat 50% of the eligible ITC they will be getting, which means assumption is what? 50% of their outward supplies will be taxable and 50% is exempted. So, now they need to choose between either option 1 or option 2. Now, whichever is feasible for them they can choose, but they have to choose it when? Beginning of the financial year, and that will be applicable throughout the financial year. Month on month they cannot choose. So, beginning of the financial year. Option 1's exercise cannot be withdrawn during remaining part of the year. Option 1 is what? Proportionate ITC option. In proportionate ITC option, they will follow Rule 42-43. Option 2, avail 50% of the eligible ITC, that is ad hoc ITC option. Now, in case of option 2, see this, usually in option 1, what is common ITC? Listen carefully. Inward supply used for taxable, fully you can take. Where? In option 1. Listen, very, very important discussion. Inward supply is used for taxable. Option 1, enjoy fully. Inward supply used for exempted. Don't take. Common ITC, proportionate. Correct. Whereas in option 2, inward supply used for taxable. Inward supply used for exempted. As well as inward supply used for both taxable and exempted. All three will be treated as common only. So I am having some inward supply used for taxable, treated as common. Inward supply used for exempted, treated as common. Inward supply used for both taxable and exempted, that is also treated as common. So the meaning of common ITC will differ. That's what I am trying to convey here. See this. In case of option 2, exclusively used for non-business and blocked ITC, ITC should not be availed. Same, option 1 also same, correct. But what is extra? 50% computed on remaining ITC, means exclusively used for exempted and exclusively used for taxable, both will be treated as common ITC. Okay. For example, say this. So ITC used for taxable, ITC used for taxable outward, ITC used for taxable outward is 1 lakh. ITC used for exempted outward is 50,000. ITC used for both taxable and exempted. Kindly make note. ITC used for both taxable and exempted, 2 lakhs. Okay. So these are the 3 inward supplies that we have, used for taxable outward, exempted outward, and both taxable and exempted. Now interest income is 60 lakhs and other income is 40 lakhs. Now what will happen in case of option 1? What will happen in case of option 1? Option 1, how much is the proportionate ITC, net ITC eligible ITC, net ITC. What we will do? 1 lakh we will take fully, 50,000 we will not take, correct? Why 50,000 we will not take? Inward supply is for exempted, so we will not take. Okay. Then option 1 is what? Proportionate ITC, correct. Are you able to understand? Inward supply used for taxable, can we take full ITC? Yes. So 1 lakh into 100% you take fully. Whereas 50,000 don't take, 0. And 2 lakhs you take proportionate ITC. How much proportionate you will take? 40%. Why 40%? Other income is only 40%. Interest income is exempted, na? Interest income is exempted. Other income is taxable. So how much ITC you will take? Only 40%. Means first you will take full ITC minus reduce exempted. So 40% literally you will take. So how much is the net ITC? 1 lakh into 100%, full 1 lakh. 2 lakhs into 40%, 80. So how much is the net ITC? 1,80,000. This is under which option? Option 1. But option 2, what you will think? You will think as net ITC equals to 1 lakh into 100% plus 0 plus 2 lakhs into 50%. No, wrong answer. All three, 1 lakh plus 50,000 plus 2 lakhs. Everything treated as common, which means 3,50,000 into 50%. 3,50,000 into 50% is what? 1,75,000. 1,75,000. So this will be the net ITC. Okay. So there is a change in the answer. So don't blindly take into 50% only. So exclusively for taxable, exclusively for exempted is also treated as common under option 2. But exclusively for taxable, treated as taxable exclusively only, and exempted we will not take, remaining only common for option 1. So this is another difference. Sir, what about blocked ITC and used for non-business, that is common, like that is treated as not eligible, ineligible only in both the places, option 1 as well as option 2. Then what is the first difference we have seen in case of option 1, option 2? Option 1 proportionate ITC, option 2 50% ITC. Second difference is what? Fully used for taxable and fully used for exempt would also treat as common in case of second option, but we will not do that in case of option 1. Then another difference, in case of option 2, restriction of 50% shall not apply to inward supplies from a distinct person. For example, there is a bank, so IDFC Bank in Tamil Nadu, so which is receiving services from its branch in Karnataka. So this is an inward supply from a distinct person. In that case, no need to reverse 50% if it is option 2. Option 1, proportionate ITC, proportionately we will take. But in case of option 2, 50% shall not apply. So which means no need to reverse 50% with respect to inward supply from a distinct person. So these are the three differences that we have between option and option 2. And you need to do this computation and finally you need to decide so which option you want, and that you need to follow throughout the financial year. So this is about 17.4. Again in this 17.4, this area is important. This can be tested. Whatever you have written now, this is something which is not tapped in exam, either in MCQ or somewhere. So in MCQ I feel it can be tested because we will do mistake. In MCQ they can highlight this. Then next one, blocked ITC. And there is one very good query, one student has asked me, sir, here you are availing the ITC, sir. Here you are availing the ITC. There is a time limit for availment of ITC. That is, so you purchased it on 1/4/2020, means it pertains to financial year 2021. So 2021 means the maximum time limit for availment of ITC is 30th November 2021 only, na sir. How you can take ITC on this date? So here Rule 43 is overriding any other general provision. Rule 43 here is a specific provision in case of conversion. So as they have given clearly that we can take ITC, which means it will be like an exception to section 16 subsection 4, time limit for availment of ITC. Usually when there is a general provision and a specific provision, always specific provision will prevail over general provision. Due to that reason, we can take this ITC, okay, no restriction of time limit. Then look into blocked credit 17 subsection 5. So the first block credit is motor vehicles related blocked credit. So total block credits means what? Ineligible credits. When you are making some purchase, you should not take ITC with respect to this. So that is block credit. We have motor vehicle related block credit, and then construction related block credit and other block credits. These are the three divisions that we have. Now first we will see motor vehicle related block credit. Motor vehicles basically divided into three. Motor vehicles for transportation of persons, that is 2-wheelers, 4-wheelers, 3-wheelers will come under motor vehicles for transportation of persons. Then vessels and aircrafts, so ships, aircrafts, helicopters, all these things will come under vessels and aircraft. Then other motor vehicles means other than these two, that is trucks, road rollers, JCB, crane, etc. will be coming under other motor vehicles, lorries and all. So other motor vehicles we don't have any restriction, ITC always available. So the restriction is only in case of transportation of persons, vessels and aircrafts. Other motor vehicles ITC always available. Whereas motor vehicles for transportation of persons divided into two. Capacity does not exceed 13 and capacity exceeds 13. Suppose if capacity exceeds 13, example buses, tempo travelers, mini bus, etc. So ITC available, we don't have any restriction. But the capacity does not exceed 13 is the blocked credit. So what is the first block credit in case of motor vehicle? Motor vehicle for transportation of persons, capacity does not exceed 13 is the block credit. However, we have three exceptional cases where ITC available for this block credit. What are the three exceptions? Number one, if the motor vehicles is used for further supply. For example, a car dealer who is buying the cars and selling the cars. Car is a motor vehicle for transportation of persons. Capacity does not exceed 13 and it is coming under further supply. So ITC available. I am in the business of renting of motor vehicles. I purchase a car. So car is a motor vehicle for transportation of persons, capacity does not exceed 13, but it is coming under further supply. Further supply, supply does not mean only sale, supply includes renting, leasing, hiring also. So therefore I can take ITC. Second point, used in the business of transportation of passengers. I am running a travel agency or Ola, Uber, etc. and all. Now in that case I purchase a car. Again car is a motor vehicle for transportation of persons, capacity does not exceed 13, but it comes under the second exception used for transportation of passengers. So ITC is available. Then third exception, driving schools, imparting driving schools. So these three cases, basically capacity does not exceed 13 means ITC not available, but in these three cases ITC available. For example, a Rapido driver purchases a two-wheeler for the purpose of using it in the business of transportation of passengers. Can he take ITC? Yes, because capacity does not exceed 13, even though it is a block credit, it comes under the exception. Now, Pizza Hut is purchasing, Pizza Hut or Domino's etc. is purchasing a two-wheeler for the purpose of food delivery. Where it will come? It will first of all not come under transportation of persons, it will come under other motor vehicles, and ITC can be availed with respect to that. And remember, motor vehicle means capacity should be exceeding, that is greater than or equals to 25 cc. So if it does not exceed 25 cc, it will not be called as a motor vehicle, okay, 25 cc, because this point in one attempt they have tested. So they tested, a company purchased a two-wheeler which is having a capacity of 10 cc. Okay, I don't know what motor vehicle is available on earth which has 10 cc, okay, but they have given a question like that. Now ITC available or ITC not available with respect to that? Yes, because first of all it is not a motor vehicle, because to come into the definition of motor vehicle, so the capacity should be how much? Greater than 25 cc, okay, so that will only be coming, and therefore it will not. And what if Dunzo, Zepto etc. people or Flipkart, they buy a two-wheeler and they use it for delivery of goods? Can they take ITC with respect to this? No. Why? Because in case of Pizza Hut or Domino's or food delivery, they will make one box on the back side, which means that it cannot be used for transportation of passengers. Consequently, it will come under other motor vehicles. But these people will not fix any box on the back, but they carry one bag with them, means the same vehicle they can also use it for transportation of persons as well. So due to that reason, it will not come under other motor vehicles, it will come under for transportation of persons, two-wheelers, and capacity does not exceed 13. And it will come under these three exceptions? No. So due to that reason, ITC not available. So some companies and all will buy two-wheelers for the purpose of giving it to collection agents. This is also one attempt they have tested. Collection agents, a company is having a lot of collection agents. For the sake of that collection agents, two-wheelers are purchased and they are giving it to these collection agents for collecting the money. Now these collection agents are basically employees of that company. Can the company take ITC on these two-wheelers? No. Why they cannot take ITC on two-wheelers? Because it is for transportation of persons. Correct or not? Persons only, na, people only, na, they will transport in that. And capacity does not exceed 13. So due to that reason, it will not be available because it will not come under the exceptions. Okay. So Rapido, why ITC available? Rapido also transportation of persons, but it comes under the second exception. What is that? It is used in the business of transportation of passengers. That's why ITC available. You got it? Then next, vessels and aircrafts. Vessels and aircrafts is also blocked credit. We have 4 exceptions for this. These 3 exceptions common. So further supply used in the business of transportation of passengers, imparting driving skills. Extra what we have is that used for transportation of goods. So for example, there is a diamond merchant. This diamond merchant purchased an aircraft for the purpose of transporting the jewelry and diamonds from one shop to another shop. Can they take ITC with respect to the aircraft purchased? Yes. Mainly it is used for transportation of goods. So due to that reason they can take ITC. Then next second part in this is that there are 4 services in relation to motor vehicles: repair and maintenance, insurance and servicing. Repairs and maintenance, servicing, difference is that servicing is usually done in the authorized service center, whereas repair and maintenance will be done in the private workshops. Then insurance is general insurance which is taken on the motor vehicles. Then hiring, renting and leasing of motor vehicles is like taking motor vehicles on rent. These 4 services are in relation to motor vehicles, vessels and aircrafts. If motor vehicles, vessels and aircrafts is eligible for ITC, then on these 4 services also ITC available. If motor vehicles, vessels and aircrafts not eligible for ITC, then on these 4 services also ITC not available. For example, there is a chartered accountant who purchased a car for use in his profession. Can he take ITC on the car purchase? No. Why? Because car means capacity does not exceed 30 and it is not coming under the exceptions. Now that chartered accountant takes the insurance on that car and along with insurance he paid the GST on insurance. That insurance GST cannot be taken as ITC. Why? as motor vehicle purchased is not eligible for ITC, even insurance service is also not eligible for ITC. Then another example, a company purchased a car for transporting its employees. Can they take ITC on the car purchase? No. Car means capacity does not exceed 13 and it is not coming under 3 exceptions. Therefore, ITC not available to the car purchase. Now, instead of purchasing the car, if they take a car on rent, can they take ITC? No, they cannot take rent ITC because as the car purchased is not eligible for ITC, renting of motor vehicle also not eligible for ITC. So, that is what we need to learn. So, what are the 4 services? Repairs and maintenance, insurance services, servicing, hiring, renting and leasing of motor vehicles. If the motor vehicle purchase is eligible for ITC, then these 4 services to that motor vehicle also eligible for ITC. If the motor vehicle purchase is not eligible for ITC, these 4 services also not eligible for ITC. Then see these key points. While determining the capacity, driver should be included. That is, while determining this 13 capacity, 13 is including the driver seat. Okay. Then next, further supply includes purchase and sale of motor vehicles or motor vehicles used in the business of renting or hiring or leasing. And repairs, insurance and servicing of motor vehicles received by a general insurance company is always eligible for ITC. Second point already I explained. Further supply means what? Further supply means not only sale but also renting. So that's what I said, I am into the business of renting of motor vehicles. I purchase a car and I give it on rental basis. Can I take ITC? Yes, I can take ITC because it is used for further supply. So it is eligible. That is the second point. Okay. So further supply includes not only sale but also renting. Then what is this third point? There is an insurance company. Say for example, I purchase one car. And for that car, I have taken a bumper to bumper insurance and this car has met with an accident. Now what I will do, I will take the car to the service center and I will not pay 1 rupee also as it is covered in the insurance. Now the insurance company will do the repairs and in the sense the service center will do the repairs and they will raise bill to the insurance company. Now the insurance company will make the payment. I will not make any payment. Now the insurance company can take ITC with respect to this bill. Yes. The restriction is not there for insurance company. The restriction is there only for the owner of the car. For me, I cannot take ITC on the car purchase, correct? So as I cannot take ITC on the car purchase, on insurance or repairs and maintenance also I cannot take ITC. But this restriction is not there for the insurance company. Repairs, insurance and servicing of motor vehicles received by a general insurance company is always eligible for ITC. Then next, hiring or renting or leasing of motor vehicle as a statutory obligation by employer to employee is also eligible for ITC and the statutory obligation can be under any law. For example, say there is a government order which says that companies which are working in night shifts should mandatorily provide cab facility to their employees, because of which they have received a rent-a-cab service. Generally, car is a motor vehicle for transportation of persons. Capacity does not exceed 13. So car is not eligible for ITC because it's not covered under these 3 exceptions. As car is not eligible for ITC, repairs, hiring, renting and leasing of car also not eligible for ITC. So rent-a-cab is a block credit. But what is the exception here? As that rent-a-cab is under a statutory obligation, so ITC can be availed. Understood how to interpret? So as the rent-a-cab, generally rent-a-cab block credit. Why rent-a-cab block credit? If the car purchased is eligible for ITC, no. So rent-a-cab also block credit. But if the rent-a-cab is under a statutory obligation, ITC available. Then what if a bus is taken on hire? Bus taken on hire for transporting the employees. Can they take ITC on that rent? Yes. Because if bus is purchased eligible for ITC, yes. As bus purchase, because bus means what? Capacity more than 13. As bus purchased is eligible for ITC, so even renting of the bus is also eligible for ITC. We don't have any restriction there. Then ambulance and caravan are not motor vehicles for transportation of persons, because ambulance and caravan will come under other motor vehicles, because ambulance and caravan is not for transporting the persons. It will come under other motor vehicles because the primary purpose of ambulance is to provide first aid during the travel, and caravan is for the purpose of short-term accommodation. So it will come under other motor vehicles, ITC can be availed. But the problem with ambulance is that as the hospital's outward supply is exempted, transportation of patient in ambulance is exempted services. Due to that reason, even though ambulance as per blocked credit, we don't have any blocked credit on that, ITC available, but there is another restriction which will come, because as the hospital's outward supply is exempted, so they cannot take ITC on inward supply, because that is what we have discussed in section 17. If my outward supply is exempted, I cannot take ITC on my inward supply. That discussion. Then, sir, what if the same motor vehicle is used for both Dunzo and Rapido, then ITC blocked or allowed? Simple. If I am using the motor vehicle partly for transportation of persons and partly for delivering the food items, etc. Now, I need to divide the turnover into two. Whatever turnover, that is whatever money that I got by way of transportation of passengers, that proportionate ITC available. Whatever money that I have collected for delivering the parcels, etc., that is as Dunzo or Zepto, ITC not available. So, what is the ratio of my receipts? If the ratio of my receipts is 80-20, means proportionately I will take. This is as good as inward supply used for partly taxable, partly exempted we have na, same way we need to do. Okay. Then another point, e-bike will be given on rental basis or kilometers, whether it is eligible for ITC. Yes, because the process is like renting. They are buying electrical bike and they are giving the electrical bike on rental basis. Rental means it will come under further supply. Further supply means no restriction and we can take ITC with respect to that. Then, look into the second area, that is construction related blocked credits. What is this construction related blocked credits? I have three inward supplies used for construction of an immovable property. ITC not available on those inward supplies. What are they? Any service, works contract service, or any goods purchased. So, what is the difference between works contract service and any service? Usually in works contract there will be both transfer of property in goods as well as construction. So, it will be for a lump sum amount. A contract involving both transfer of property in goods as well as provision of service in relation to an immovable property for a single consideration, then it is called as works contract. For example, I want a building to be constructed. I can buy the material required for construction from the market and I can appoint a construction contractor. That will be called as a pure labor contract, wherein the service provider will provide only the construction service. Suppose if I am not buying the material from the market, I ask the supplier only to buy the material from the market and he also provide the construction service, then the name of that contract is known as works contract. So, whether it is any service, construction, interior decoration, architect, any service, or works contract service, including goods purchase for construction of an immovable property is blocked credit. These are the three blocked credits. However, we have three exceptions to this where ITC available. What is the first exception? The above discussion is not applicable to supplier. That is, works contractor will buy the material na, he can take ITC. There is no restriction. Works contractor will receive interior decoration service. Works contractor will receive construction service. He can take ITC. The restriction is only to owner of the property. Owner of the property cannot take ITC with respect to the inward supplies. And second, construction of plant and machinery. For example, construction of lifts and escalators or construction of any machinery, etc. We can receive these goods or works contract service or any service, we can take ITC. But plant and machinery excludes telecommunication towers and pipelines laid outside the factory gate. Suppose if the pipelines are laid inside the factory gate and for that pipelines if you receive construction service, can you take ITC? Yes, it will come under plant and machinery. Suppose if we are constructing a telecom towers, for telecom towers we will construct a foundation, cement foundation. For that cement foundation we purchase a cement, can we take ITC? No, because plant and machinery excludes telecommunication towers. And for laying down pipelines outside the factory gate, we receive some construction service. Can we take ITC on that? No. Why we cannot take ITC on that? Because plant and machinery excludes pipelines laid outside the factory gate. Then, suppose if construction expenditure is charged to P&L, then also ITC available. So, because if construction expenditure is capitalized, then only ITC not available, but if it is charged to P&L, ITC available. Okay. Now, in the absence of information in the question, you assume that the construction expenditure is capitalized unless it is given specifically that construction expenditure is charged to P&L. So don't take the assumption. So this is common for all blocked credits. Remember, in everywhere in the blocked credit they have given an exception. Now in the question they gave the blocked credit, but they did not give exception, which means that exception is not satisfied. You understood? Example they gave, construction of building, so much is the GST paid, like that they have given. Now generally construction of building block credit, there is an exception when if the construction expenditure is charged to P&L. Is the exception given in the question? Not given in the question, means that exception is not satisfied, and which means it is blocked credit only. You got it? Then another case, we have seen motor vehicles, car purchased and used in the business. They didn't give anything, means the exception should be given, na? What is that exception? Used in the business or transportation of passengers, or used for driving skills, or further supply. They have not given, means exception not satisfied. Exception not satisfied means blocked credit only. Got it? And then they will give, so a factory purchased a car for transporting its workers, but they did not tell statutory obligation. If they have given statutory obligation, then only it will be exception, otherwise exception not satisfied. You got it? Be careful in the way you read the questions. Okay, same way here, nothing given. Plant like construction expenditure they gave, but they did not give. Construction of a factory shed, GST paid 2 lakhs. What is your answer? Blocked credit. Why blocked credit? Because factory shed definitely capitalized. Suppose if they say construction of a factory shed where the expenditure is charged to P&L, then ITC available, that is this. If construction expenditure is charged to P&L, then also ITC can be availed on above inward supplies. Now, in this regard, I want to add one more point. Basically, these builders who are constructing residential buildings, generally builders don't have any blocked credits. Builders can enjoy the ITC. So, because first exception, the above discussion is not applicable to a supplier. Means if a builder is purchasing the material, if builder is receiving the construction service, they can take ITC. Now that builder is constructing a residential apartments. Residential apartments, the rate of GST is 1.5% or 7.5% without ITC. You can see sale of building by a promoter or builder when covered under supply, GST 1.5% or 7.5%. In which case it is 1.5% or 7.5%? Residential apartments or units will be having the rate of GST 1.5%, 7.5%. So usually the rate of 1.5 or 7.5 is without ITC. Means can they take ITC on the inward supplies? No. Even though there is no restriction for the builder, but as the builder is doing residential construction, the rate of GST for residential construction is 1.5 or 7.5 without ITC. So they cannot take ITC on inward supplies. ITC not available even though such inward supplies are not blocked credit. Suppose if the outward supplies are taxable at 12% or 18%, which one? Commercial constructions like bridges, roads, and then commercial complexes, etc. The rate of GST will be 12% or 18% with ITC. So can they take ITC with respect to this inward supplies? Yes. ITC available on inward supplies other than blocked credit. So they don't have any blocked credit now, so ITC they can enjoy. Got it? That is with respect to this. Next, other blocked credits you see. Other blocked credits. Membership of a club, health and fitness center is the block credit. And what is an exception for that? If it is provided by employer to employee under a statutory obligation. Membership of club, health and fitness center. Gym membership, blocked credit. Social club membership, blocked credit. But on the GST paid, sir, yes, GST is paid on that, but it will be a blocked credit. So like lot of people, but it's a business expenditure. I'm not talking about personal expenditure, because if it is a personal expenditure, anyhow it is not eligible for ITC, because section 16, the second condition says the inward supply should be used or intended to be used in the course or furtherance of business. So here it is a business expenditure only, but even then it is blocked credit. Membership of a club, health and fitness center. What if government has mandated the company to take membership of a social club on behalf of their employees, and in that case on the GST paid can be taken as ITC, yes, that comes under the exception employer to employer under statutory obligation. Then second point, travel benefits extended to employees on vacation. So employee is going on a vacation and the travel expenditure borne by the company. Now company cannot take ITC with respect to the travel expenditure. However, same exception, if it is incurred under a statutory obligation by employer to employee. Suppose if the law mandates that the employer has to mandatorily provide the travel facility, leave travel facility. In that case, if the employer has borne that expenditure, can he take ITC? Yes, because this is under a statutory obligation. Now, the employee is going on a business visit. Can the ITC be taken? Yes, ITC can be taken because the point given is employee is on vacation. The next one, non-resident taxable person, NRTP. So, non-resident taxable person is a person who is coming from outside India to India, who is not having any fixed place of business in India. So, this NRTP can take ITC only on import of goods. Exception is only import of goods by the NRTP. So, basically these NRTPs can come into India for the purpose of providing any services or supplying any goods. Example of NRTP you remember. So, these cricketers basically who come to India to play IPL matches will be coming under NRTP. Now that it is IPL season, so lot of foreign cricketers and all will be coming to India. And what is the stay? Will the stay be for a period more than 180 days? No, definitely not more than 180 days. Hardly 90 days they will stay. So that too depends upon which team they are playing and which team will go for qualifiers, playoff, etc. and all. So therefore, why they will stay for 180 days and all? They will not stay. So which means they are called as a NRTP, non-resident taxable person. They are coming from outside India to India, except Warner, every other person will come under NRTP only, because Warner will behave as if he is Indian only. All his reels and all will be based on Indian movies reels only, okay. So, except David Warner, every other person literally NRTP. They don't have any fixed place of business in India and they will enter into India to make supply of goods or services. Now, can they take ITC on any inward supply that is in India? No. Only on import of goods. What goods they will import, sir? Their cricket kits, garments, etc. and all they will be importing. Why they will import that? Yes, baggage and all they will not be bringing, because recently one Ambani great Indian fat wedding has happened. So in this wedding, so one person has come for dancing, you understood? No, singing. So I don't know what is her name also. Rihanna, okay, Rihanna came. And when Rihanna came, Rihanna was not great news. So her costume was a great news. Like some big luggages came, cargo containers, luggage and all came in cargo containers. Like that, these cricketers and all will be bringing their luggage in cargo. That will be import of goods. On import of goods, customs duty along with IGST paid, that IGST can be taken as input tax credit. Apart from that import of goods, no other inward supplies they can take ITC. That is about NRTP. Then food and beverages. Remember, food, beauty, insurance. Food, beauty, insurance. So food and beverages, outdoor catering related to food. Beauty treatment including cosmetic surgery, plastic surgery, hair transplantation. Number 3, insurance, life insurance and health insurance. These 3 are blocked credit. Food, beauty and insurance is block credit. However, we have 3 exceptions to this. First exception, common, statutory obligation. Statutory obligation, that exception is there, provided by employer to employee under a statutory obligation. Example, there is a factory which is providing food to their workers, which is under the statutory obligation under Factories Act. Now they purchase the food. Can they take ITC on the food purchase? Yes, because it is under a statutory obligation even though it's a block credit. Then first exception, inward supply, outward supply in the same category. So for example, there is a hospital which is providing cosmetic surgery to its patient. Cosmetic surgery is taxable. Now they don't have a surgeon, so they approach another hospital. Another hospital provided the cosmetic surgeon and billed to this hospital. Can this hospital take ITC with respect to that? Yes, because inward supply, generally cosmetic surgery is block credit, but inward supply, outward supply in the same category, so ITC will be available. Then inward supply is part of composite or mixed outward supply. There is an airline company which is into the business of transportation of passengers and providing food to their passengers. Now they purchase the food. for providing it to their passengers. As inward supply is part of outward supply, they can take ITC on food and beverages purchase. So first block credit is what? Food related to food and beverages, outdoor catering, related to beauty treatment, cosmetic surgery, plastic surgery, hair transplantation, related to insurance, life insurance and health insurance. These three are block credits, but three exceptions. First exception, inward supply, outward supply, same category, inward supply part or component of outward supply, and statutory obligation employer to employee. Then balance blocked credits. Suppose if you are purchasing from a person opting for composition scheme, it's a blocked credit. Moreover, it is already given there in the meaning of input tax. Input tax excludes tax under composition scheme. Then if you are making purchases and used for personal consumption, you cannot take ITC. It is also already given in section 16. Inward supply should be used or intended to be used in the course or furtherance of business. If it is used for personal purpose, we cannot take ITC. Again, it is repeated as blocked credit. Suppose if it is used in obligations under CSR, Corporate Social Responsibility under Companies Act. So there every company has to spend their 2%, I think, some average profits, 2% they need to spend for CSR. So this amount of spending involves, some expenditure. On that expenditure, there will be some GST paid. So these expenditures, what and all will be constituting CSR like that, one schedule is there. So in that schedule, they will specify these activities they can do. For these activities, some spending will be involved. In that spending, every expenditure will have a GST component. Can the GST component be taken as ITC even though it is like a business expenditure? No, it cannot be taken because it is a blocked credit now. That's an amendment. Then goods lost, stolen, destroyed, written off or disposed of by way of gifts or free samples. I am purchasing some goods and that goods got stolen. I cannot take ITC. And that goods got destroyed because of fire accident. I cannot take ITC. So that can be even destroyed on account of natural calamities also. Normal or abnormal, it is irrelevant. So therefore, whatever the goods purchased are lost, stolen, destroyed, written off for any reason, ITC not available, or disposed of by way of gifts or free samples. So I purchased some goods and I disposed of those goods as gifts or free samples. I cannot take ITC on those goods purchased. Suppose if that gifts or free samples constitute supply, can I take ITC? Yes, that's an exception that we have. See the note. If gifts or free samples treated as supply under 7(1)(c), then ITC not required to be reversed on inward supplies. For example, there is a company. So that company wanted to give a mobile phone as a gift to their employee. So there is a company which is giving a mobile to their employee, gift of mobile. Gift of mobile. Okay. And they have to buy the mobile now. So therefore, from a supplier, so this company has purchased mobile, purchase of mobile, and the value of this mobile purchased is 60,000 plus 12% GST. Now, gift of mobile to employee. Is this supply or not a supply? This will become supply. Why it will become supply under 7(1)(c)? Because the value of gift exceeds 50,000. So as value of gift by employer to employee exceeding 50,000 per annum per employee is a supply, and employer and employee are treated as related parties. So value of gift exceeds 50,000 per annum. So it is supply. As it is supply, can the company take ITC on the mobile purchase? Yes, ITC available. Okay, so that will be 60,000 into 12%. That is 8,000, 7,200. So they can take this 7,200 as ITC. There is no restriction with respect to that. That's what I said. Generally, gift of mobile is blocked credit. But if gift of anything is blocked credit, but if that becomes supply because of 7(1)(c), then they can take ITC on the gifts purchased. There is no restriction. So that is this note. Basically, gift or free sample block credit. But if gift or free sample treated as supply under 7(1)(c), then ITC not required to be reversed on inward supplies. And then One more point, if GST is paid under section 74, 129 or 130, 74 talks about short payment of GST, non-payment of GST or wrong availment of ITC, etc. on account of fraud, okay. Then 129 is, we are transporting the goods without valid documents, then the officer will stop that vehicle and will seize those goods and will recover the penalty from us. 130 is confiscation. In these three cases, supplier has not paid the GST voluntarily, but it has been recovered from him by the government. Now, you cannot take ITC as a recipient, but logically this point is meaningless now. Why it is meaningless? Sir, if he has not voluntarily paid, he would not have reported in GSTR1. Correct? He has intention to evade, boss, means he would have not reported in GSTR1, means it will not come in 2B. If it is not coming in 2B, you cannot take this as ITC. You got it? Had he reported in GSTR1, these sections will not come. These sections are coming in which place? Only when he is not reporting in GSTR1. Okay. So it has been recovered from him, GST paid under these sections, and such GST is not matched ITC. Basically, it is not a matched ITC. Why it is not a matched ITC? Because he will not report it in GSTR1 and it cannot be availed. Sir, but he can rectify now, sir. He voluntarily did not pay, but thereafter it has been recovered from him. Now can he rectify the return, sir? Usually there is a concept of rectification of return. GSTR1 we can rectify and in amendment we can add now, sir. Yes, yes. But that amendment should not be on account of any audit or investigation or any enforcement activity. Voluntarily, if you made a mistake and you identify that, you can add, because this point is there in rectification of returns. So in the returns chapter, if you see page 137, rectification of returns. So GSTR1 we can rectify. But when you rectify GSTR1, the rectification should not be on account of scrutiny, audit, inspection or enforcement activity. Means your supplier has not voluntarily paid. It has been recovered from him. The moment it has been recovered from him, through amendment, he can think, through amendment I will add it in GSTR1. So when he adds in GSTR1, it will come in your 2B. So you can take ITC. But the problem is that it should not be done. Why it should not be done? It is not in input tax credit. Some other place it is restricted, wherein they are telling you cannot do the rectification of return on account of scrutiny, audit, inspection or enforcement activities. Got it? So which means once he has not voluntarily paid and it has been recovered from him, he can never put it in GSTR1. When he cannot put it in GSTR1, it will not come in 2B. If it is not coming in 2B, you cannot take that as ITC. That's a conclusion of this story. So this is about that blocked credit point. Then, so we have completed blocked credits. See the next discussion, section 18. Section 18 talks about ITC in special cases. Sir, rate of GST is 5% for construction of buildings. No, it is 1.5% and 7.5% only. That 1% and 5% is the effective rate of GST. How that effective rate is arrived? Usually, whenever we sell any flat, so including the land, UDS, we will get a 1/3 reduction with respect to the contract price. Okay. So say this, for example, contract price is contract price of flat including UDS is 75 lakhs. Now in this case we will get 1/3 reduction towards UDS. You will get a reduction. This is an exemption we have. So which means 25 lakhs will be exempted. So what is the value on which GST payable? Value on which GST payable will be 50 lakhs. And what is the rate of GST? Rate of GST is 7.5%. So GST payable will be 50 lakhs into 7.5%. So that will be 3,75,000. But normal layman cannot understand this. Why 1/3 reduction? What is UDS? All these things builders cannot explain to the buyers. So what they will tell is that this 75 lakhs into 5% is GST. That will also come to 3,75,000. Okay. So rather than putting this way, in market, this is the way in which it will be shown, 5% like that. So we also, like stupids, we will think that 5% is the rate of GST. 5% is not the rate of GST. The rate of GST is 7.5%. This only you need to follow for exam purpose. Okay. So in reality, you can follow anything, but for exam purpose, don't write 5%. You know what? When you do this exemption also will give 1/3. Thereafter, if you do 5%, answer will be wrong. Okay. So this is the only way in which you need to do. So don't remember the rate as 1.5%, 1% or 5%. Remember it as 7.5%, 1.5%. That is one question. Then next, seating capacity 13, any logic, regular batch. Then will e-bike comes under motor vehicle definition? Actually yes, because the power can be, the power of propulsion can be through the internal source or can be from the external source. So either using fuel it can be, or it can be from recharge, electric charge. Okay, both will be coming under motor vehicles. Okay, simple logic. Usually for electric vehicles also registration is required, and for whichever electric vehicles registration is required, those vehicles and all will be automatically coming under motor vehicles. Okay, so it will come. Then next, they have taken solar panel as immovable property. Yes, of course, solar panel immovable property only, but it will come under plant and machinery. The solar panel will come under plant and machinery. In RTP, yes, there is one question related to that. It should be plant and machinery, dear. Okay. Then can Swiggy take ITC on its inputs? Buying from other restaurant food? No, because basically the rate of GST applicable for food is 5% without ITC. So due to that reason, so restaurants which are supplying food cannot take ITC, because that is like rate related provision. Those rate related provisions and all you don't have, so don't worry about that. And then yes. Sir, will you solve few questions for better understanding? I am doing that. Really, I am doing. See how many questions I have written from morning. I am doing, no? This only I can do. You cannot expect me to solve, past exam questions, all these things. There is a limit, bro. Bro. Say this. Section 18, availment of ITC on closing stock. So this is about section 18 subsection 1. That is, there are 4 situations where we can take ITC on closing stock. So 18(1)(a), a person is liable to get registered and applied within 30 days. So before I was not registered, now I am liable to get registered. I made application for registration within 30 days. Now before the date I am liable to get registered, I have some closing stock. On that closing stock, I have not taken ITC. Why I have not taken ITC? Because at the time when I purchased the closing stock, I was an unregistered person. Now I am registered, I will use this closing stock, so I can take ITC on the closing stock. See this, you are liable to get registered and you made application within 30 days. Now you have some inputs. What is the meaning of closing stock? Input as such held in stock, inputs in the form of WIP held in stock, and inputs in the form of FG held in stock. And which date closing stock should be taken? Immediately preceding the date on which he is liable to get registered. And so this stock should have been purchased within 1 year prior. So means on obsolete stock or non-moving stock and all, they are not giving credit. They are giving credit only on those stock which is purchased within 1 year prior to the closing stock date. Why they are giving ITC? Why we have not taken ITC at the time when it is purchased? Because at the time when you have purchased, we were unregistered person. Being unregistered person, we cannot take ITC. Then why are they giving now? Because using the closing stock, we are making outward supplies. And when we make outward supplies, we need to pay GST on that outward supply. So logically, they are giving ITC on the closing stock. Then 18(1)(b). What is the difference between 18(1)(a) and 1(b)? 18(1)(a), I am liable to get registered and I made application for registration within 30 days. But in 18(1)(b), I am voluntarily getting registered. But the closing stock meaning is same. Inputs as such held in stock, inputs in the form of WIP held in stock, inputs in the form of FG held in stock. Which date I need to take? Before the date I get the registration certificate. So whatever is the closing stock. Sir, on capital goods, can we take credit under 18(1)(a), 1(b)? No. Why they are not giving credit on capital goods under 18(1)(a), 1(b)? Because 18(1)(a), 1(b) do not require matching. Moreover, matching cannot be made. Why matching of ITC cannot be made? At the time when you purchased, you were a unregistered person. Being an unregistered person, you would not have given your GSTN. Means your supplier would have shown it under B2C supplies. So which means you cannot take ITC with respect to that. So that's the reason why matching is not required. As matching is not required, definitely fake invoices can be brought, and capital goods and all involves a huge credit. So that's why they are not giving credit in case of 18(1)(a), 1(b) with respect to capital goods. But if you see 18(1)(c), 1(d), for 18(1)(c), 1(d), they are giving credit on capital goods. And when 1(c), 1(d) will be applicable, you were under composition scheme. So under composition scheme, you would not have taken ITC. Now you have migrated to normal scheme. Under normal scheme, you can enjoy the ITC. So from the date you are migrating from composition scheme to normal scheme, at that time there was some closing stock. Now on that closing stock, GST paid can be taken as ITC. But what is the meaning of closing stock here? Same. Inputs as such held in stock, inputs in WIP held in stock, and inputs in FG. What is the extra point we have? Capital goods. But sir, capital goods, can we take full credit? No. You cannot take capital goods full credit. It should have been purchased past now. So we should reduce. How much we should reduce? Usually what is the depreciation for ITC? 5% for every quarter or part thereof. So see the note below. In case of capital goods, ITC shall be GST paid minus 5% into number of quarters from the date of purchase till the date of migration or conversion. For example, say this. So it is like on 1/4/2024, I am moving into regular scheme. And before that, I was under composition scheme. Now, when I was under composition scheme, I would not have taken ITC. Now, I am migrating from composition scheme to regular scheme. Now, previously, when I was under composition scheme on 8 February 2023, I purchased capital goods, and the value of that capital goods is 10 lakhs, excluding GST at 12%. Now, how much ITC I can take in case of regular scheme? How much ITC I can take on this capital goods under regular scheme? Calculate that. So this is under 18(1)(c) na? Yes, 18(1)(c), composition scheme to normal scheme. So how much is the ITC under section 18(1)(c)? How much is the ITC? So capital goods is purchased and on which GST is paid. So 10 lakhs into 12%. How much? 1 lakh? 1,20,000 minus 5% into how many quarters? 8/2/2023 I purchased. 8/2/2023 when I have purchased it, you count the number of quarters. So that is Jan, Feb, March 1 quarter. Then again April, May, June, July, August, September, October, November, December, again Jan, Feb, March. So 5 quarters, correct. So 5% into 5 quarters, that is 25%. How much? 1,20,000 into 25%? 30,000. So 30,000 we need to reduce. and remaining 90,000 we can take as ITC. You understood? You do this way so that your result will be fail. Kumuttai, we have discussed within 1 year back only it should be purchased, correct? Am I right? So the above closing stock including capital goods should have been purchased within 1 year prior to closing stock date. So everything don't nod your heads. So 1/4/2024 means within 1 year prior. Here you will not get 1 rupee also. ITC will be 0. Why ITC will be 0? Because the capital goods are purchased before 1 year. We cannot take ITC on that capital goods and all. For 18(1)(c) or 18(1)(d), all the goods including capital goods should have been purchased within 1 year prior. Capital goods are not purchased within 1 year prior to, what is the closing stock date? 31st March 2024. Okay. So means everything should be purchased within 1 year prior, including the capital goods. Then, how to avail this ITC? Whether we avail this ITC in GST or 3B? No, we need to file one declaration in ITC 1. And that ITC 1, when we should file? Within 30 days from the date of migration or from the date of registration, like that. Okay. Now, one more case you see, 18(1)(d). What is 18(1)(d)? A person whose exempted supplies became taxable. When exempted supplies became taxable, he need to take ITC. At the time when his outward supply was exempted, he would not have taken ITC. Now the moment exempted supply became taxable, he can take ITC on his closing stock. So, but again, what is the closing stock? Same. Inputs as such held in stock, inputs in WIP held in stock, inputs in FG held in stock, and even on capital goods. And which date? Immediately before the date of such conversion. Okay. So, what are the 4 situations that we need to remember? Liable to get registered and made application for registration within 30 days. Voluntarily got registered. Number 3, registered person migrated from composition scheme to normal scheme, and registered person exempted supplies have become taxable. Now, in these 4 situations, what is the difference between first 2 situations? So, first 2 situations, liable to get registered and made application within 30 days, voluntarily got registered, and date also will change. So, in first case, it is before the date the person is liable to get registered. Second case, immediately before the date of registration. Then, what is the difference between third case and fourth case? Third case, composition scheme to normal scheme. Fourth case, exempted supplies to taxable supplies. And date also same, immediately before the date of migration, here immediately before the date of conversion. What is the difference between first 2 points and the next 2 points? First 2 points we cannot take ITC on capital goods, but the next 2 points we can take ITC on capital goods. How much ITC we can take on capital goods? Total GST paid minus 5% for every quarter or part thereof from the date of purchase till the date of conversion. And one more difference, first difference is capital goods. Second difference, matching is required in case of 18(1)(c)(1)(d), but 1A 1B matching is not required. And third difference, 1A 1B is applicable for an unregistered person who is now only getting registered, but 1C 1D is applicable for a registered person whose outward supplies became taxable from exempted, or registered person who is migrating from composition scheme to normal scheme. Now, let us see one more situation in this. That is, I commenced business on 10/5/2023. Commenced business on 10/5/2023. Making exempted supplies. So, as I am making exempted supplies, I am exempted from registration, correct? Making exempted supplies, and on 1/10/2023 exempted supply became taxable. Exempted supply became taxable, and person got registered. Person got registered after 1/10/2023. Okay. Now, capital goods capital goods purchased in 31, purchased on 31/7/2023, whether ITC available. Whether ITC available. It is purchased within 1 year prior only. But why ITC not available? Because in this case, the applicable section is 18(1)(d) or 18(1)(a. No, applicable section is 18(1)(a, not 18(1)(d). Why not 18(1)(d)? 18(1)(d) is applicable when registered person's exempted supply becomes taxable. But is this person a registered person? No. Now only he is getting registered. So applicable section is 18(1)(a but not 18(1)(d). Under 18(1)(a) can we take ITC on capital goods? No. Therefore ITC cannot be availed. Cannot be availed on capital goods. Clear? That is with respect to this. Next one, see below. Here, all the above closing stock should be purchased within 1 year prior, and ITC with respect to GST paid on inputs can be availed as ITC, no restriction. Full ITC you take, inputs no issue. But for capital goods alone, we need to reduce 5% for number of quarters from the date of purchase till the date of migration or conversion. And one electronic declaration we need to file to take this ITC, that is ITC1, and that ITC1 should be filed within 30 days. In case of 18(1)(a), from the date we get the registration certificate, 18(1)(b) from the date we get registration certificate, 18(1)(c) from the date of migration, 18(1)(c) from the date of conversion, within 30 days or extended time limit. And suppose if the claim of ITC exceeds 2 lakhs, it should be certified by a CA or CMA. Suppose if the ITC claim does not exceed 2 lakhs, then it will be self-certification. So this is about 18(1) and 18(2). 18(3) will be applicable in case of transfer of ITC. So whenever I transfer my business with specific provision for transfer of liabilities, so whatever is the unutilized ITC from the transferor will be transferred to transferee's electronic credit ledger. So but remember, the transfer of business should be with specific provision for transfer of liabilities, means both assets and liabilities should be transferred, means it should be transfer in the nature of merger or amalgamation, but it should not be mere procurement of assets or procurement of brand name or a simple takeover. So there should be all risks and rewards incidental to the business should be transferred, means assets and liabilities should be transferred, and the transferee should have the intention to continue the business as a going concern. So then only it will be called as transfer of business with specific provision for transfer of liabilities. Then transferor will file one form, ITC2. ITC1 is for availment of ITC on closing stock, ITC2 is for transfer of ITC in case of transfer of business. And this ITC2 should be certified by a CA-CMA. ITC1 should be certified by CA-CMA if the claim of ITC exceeds 2 lakhs, but ITC2 should be certified always, whatever may be the amount. And what is that CA-CMA will certify? That this business is with specific provision for transfer of liabilities. Then in case of merger of two companies, say A Limited and B Limited gets merged into AB Limited, no issue. So whatever ITC that is there in A Limited will be transferred, whatever ITC that is there in B Limited also will be transferred. So this is not a big deal. But when AB Limited is getting demerged into A Limited and B Limited, now from single source the ITC needs to be transferred. Then what is the ratio to be followed? So you take the assets ratio of A Limited and assets ratio of B Limited immediately after demerger, and the ITC will be transferred. In case of demerger, credit shall be transferred to the new entities in the ratio of net assets. So we should take all assets, whether ITC is availed on that assets or not availed on that assets, that should be taken post demerger. Then transfer or change in ownership also includes transfer or change in ownership due to death of sole proprietor. So what happens is that there is a sole proprietor who is dead, and his son has taken over the business. In that case also ITC can be transferred from the father's GSTN to son's GSTN. Should the son get a new registration? Definitely son should get a new registration, because there is a death of sole proprietor, means permanent account number changes. When the permanent account number changes, GSTN is connected to permanent account number, so new registration should be obtained, and thereafter son can log in the name of the father and he can file ITC2 for transfer of ITC from father's credit ledger to son's credit ledger. Then transferor and transferee should be in the same state. So this is the restriction which is given in the portal, and that is included in the circular. So one CBSE clarification has been given. For example, transferor is in Tamil Nadu, transferee is in Karnataka, ITC cannot be transferred. So means transferee should get a registration in Tamil Nadu and then only the ITC can be transferred. So transferor and transferee should be in the same state. Then this transfer of ITC is also applicable in one more case. What is that? There is a single registration which is now converted into multiple registrations. For example, within the state we have an option whether to go for single registration or separate registration. For example, say in Karnataka there is a person who is having a place of business as Bengaluru, Hubli and Mysuru. Like that, three places a person is having place of business, and he was under a single registration, because it is optional. When I have multiple place of business, either I can go for single registration or I can go for separate registration. Now I am going for single registration in Karnataka and it is optional for me, so I selected single registration. Now so far I am having one GSTN in Karnataka. Now as my business demands, so I want to go for separate registration. So I got separate registration in Bengaluru, Hubli and Mysuru. I am getting a separate GSTN. Separate GSTN in Bengaluru, separate GSTN in Hubli and separate GSTN in Mysuru. Now so far I was doing business in the single GSTN. Now from the single GSTN, the ITC will be transferred to all these three GSTNs. Okay. So for that purpose, because so far I have been doing single registration only, means ITC will be accumulated in that registration. That ITC can be transferred, for which one ITC 2A form needs to be filed for transfer of ITC between single registrations to multiple registrations. So that is this. When a single registration gets converted into multiple registrations, then ITC against single registration can be distributed to multiple registrations by filing one form. What is that form? ITC 2A. In what ratio, sir? In what ratio? Simple, assets ratio. Same way. In demerger visa, assets ratio. In that assets ratio between these three registrations, ITC can be transferred. Then next we are looking into 18 subsection 4 and 29 subsection 5. This is with respect to reversal of ITC on closing stock. This is opposite of 18(1)(c) and 18(1)(d). 18(1)(c) is what? A registered person migrated from composition scheme to normal scheme. Now opposite, normal scheme to composition scheme, means he is going into composition scheme. As he is going into composition scheme, he cannot enjoy the ITC. So he need to reverse the ITC. Then registered person, exempted supplies became taxable. Okay, now taxable supplies becomes exempted. So as the taxable supply become exempted, he need to reverse the ITC on closing stock. So what are the two situations that we have seen? Normal scheme to composition scheme, taxable supplies to exempted supplies, or cancellation of registration, third case. So reversal of ITC on closing stock in three situations. What are the three situations? Normal scheme to composition scheme, taxable supplies to exempted supplies, cancellation of registration. Say on 1/4, so this happened. Now you take the closing stock as on before date. What is it before date? 31st March. As on 31st March, what is the closing stock? Input as such held in stock, input in the form of WIP, inputs in the form of FG. These three inputs, whatever ITC we have already availed, that we need to reverse. ITC availed equals to ITC reversed. Whereas capital goods also we need to reverse. How much we need to reverse for capital goods? ITC availed divided by 60 into balance life. So here we follow a different way. So it is not minus 5% for every quarter or part thereof. So far everywhere it is minus 5% for every quarter or part thereof. In this place alone, what we will do, total ITC divided by 60 into balance life. So that's what we will do as ITC reversal. Now sir, I have one doubt. While availing the ITC on closing stock, you told that the closing stock including capital goods should have been purchased within 1 year prior. While reversing the ITC on closing stock, that 1 year time limit is not applicable. No, not applicable. Even if 3 years before you buy also you reverse. You understood? Because availing ITC is loss to government. So time limit, reversal of ITC is gain to the government. So therefore no time limit. Even 3 years, 4 years before if you have purchased also, you can happily do the reversal. Okay. Then inputs and capital goods can be purchased any time on which ITC is availed. If ITC not availed on such inputs or capital goods, reversal shall not arise. Suppose if capital goods is purchased before 5 years, then it will become 0. Why it will become 0? ITC avail divided by 60 months, 5 years over, into balance life 0. Anything multiplied by 0 is 0. So we don't have to do any reversal. If capital goods are purchased before 5 years on which ITC is availed, then reversal shall not arise. Now, sir, matching required or not required? Not required. Reversing, na? Why matching? Availing only matching. You understood? Reversal, gain to the government, no matching. Matching not required. But then, what if invoice is not there? Don't worry. Today, you will have a market value for these goods. You take that market value and do the reversal. And as you are taking market value, get a certificate from a CA or CMA. Okay. If invoice pertaining to such capital inputs are not available, then market value can be considered and a practicing CA or CMA certificate is required in that case. And all these details of reversal will be reported in ITC 3. ITC 1, availment of ITC on closing stock. ITC 2, transfer of ITC. ITC 2A, transfer of ITC from single registration to multiple registration. ITC 3, reversal of ITC on closing stock. ITC 1, when CA CMA certification, ITC amount exceeds 2 lakhs. ITC 2, always CA CMA certification. ITC 2A, not at all required. ITC 3, CA CMA certification if market value is replaced with invoice value. Then, suppose if there is any balance in ITC after reversal, sir, what will happen with respect to the balance? Balance will be lapsed. And suppose if there is any shortfall, then we need to pay that shortfall. For example, so what is the ITC? Say this, case A, case B, the balance in ITC before reversal. Balance in ITC before reversal. Before reversal, case A 2 lakhs, case B 1 lakh. Then reversal of ITC on closing stock. Reversal of ITC on closing stock is 1,25,000. Now what will happen? So here 1,25,000 we will adjust with 25,000 and balance in ITC 75,000, here 0. This 75,000 will be lapsed. That will be lapsed. And what is the GST payable? Whether we need to pay any GST? Yes. Here 25,000 we need to pay. Why 25,000 we need to pay? How much was the balance? 1 lakh. How much we need to reverse? 1,25,000. This 1,25,000 we will adjust from 1 lakh. So remaining 25,000 we need to pay. Whereas in this case 2 lakhs and 1,25,000 we will adjust. Remaining 75,000 will be lapsed. Anyhow it will be lapsed na sir, then why we need to do reversal? Mainly to know whether GST is payable or the ITC will be lapsed. For that reason only we need to do this computation. And this computation should be done separately for CGST, SGST, UTGST and IGST. Then this 18 subsection 6 already I told you. Remember when 18 subsection 6 will be applicable? I am purchasing some capital goods. At the time of purchase of capital goods I have availed the ITC and that capital goods is being disposed of. So in that case the GST payable will be ITC availed minus 5% for every quarter or part thereof from the date of invoice till the date of supply, or compare it with what? GST on sale value of that capital goods. Whichever is lower should be taken or whichever is higher should be taken. Whichever is higher. But we have an exception to this. In case of refractory bricks, molds and dies, jigs and fixtures, three goods you remember, refractory bricks, molds and dies, jigs and fixtures. If it is sold as scrap, then in such case GST is payable on normal sale value. So means ARB whichever is higher not applicable, just the B point only will be applicable. Then next section 19 talks about job work provisions. So section 19 should be read with section 143 of CGST Act. What does it says? So I am sending the inputs or capital goods for the job work, and at the time when the inputs or capital goods are sent for the job work, I don't have to reverse any ITC on that. Normally I can send. But from the job worker's place, the inputs are capital goods, the processed goods or the capital goods should be brought back. What is the time limit within which it should be brought back? Processed goods should be brought back within 1 year, and capital goods should be brought back within 3 years. This 1 year can be extended for a further period of 1 year, and the capital goods can be extended, 3 years can be extended for a further period of 2 years. Remember, 1 plus 1 year, 3 plus 2 years. So processed goods should be brought back within 1 year, and capital goods should be brought back within 3 years. And capital goods or inputs, first we will see inputs. Inputs to be received within 1 year, which is sent directly from the principal's place of business, and if it is not received within the time, it will be deemed as supply on the date of receipt by the job worker. For example, I am sending the goods to the job worker, you are the job worker, I should have got the goods back from your place within 1 year, you did not send me, then on expiry of 1 year, it will be deemed as supply in my hands. So means 1 year back itself it was supply, now I will come to know that it is supply, now I have to pay GST. So logically I need to pay even GST. For example, 1/4/2023, I sent you inputs here, and you should send me the processed goods by what time? 31st March 2024. You have not sent. As you have not sent, so 1 year time limit is over. Further it can be extended for a further period of 1 year by the commissioner. Commission is not giving extension. Now it will be treated as sale in my hands. On which date? On which date it is treated as sale in my hands? 1/4/2023, 1 year backwards, and I have to pay GST now. Now means which date I am in? 1/4/2024. You got it? And I have to pay GST pertaining to which month? 1 year before. Means I have to pay interest for last 1 year. That is the additional burden that I will be having. You got it? And this GST I will recover from you. Got it? Because of your mistake only now I have paid, so I will recover it from you. Now what happens? You have returned the goods to me after this 1 year. Now in that case, whatever ITC that I have, whatever GST that I have paid, I will reavail as ITC. No. It will be treated as new sale made by the job worker to the principal. You got it? So section 143 basically puts the time limit. What is the time limit? The goods should have been brought back to the principal's place within 1 year plus 1 year in case of processed goods, and capital goods should be 3 years plus 2 years. If 143 breached, then what will happen? Section 19 will come into picture, that is deemed fiction. What is a deemed fiction? It will be deemed as supply. On which date it will be deemed as supply? On the date of dispatch to the job worker. Okay, now see this. ITC not required to be reversed by principal when goods are sent on job work, and such goods should be sent under the cover of a delivery challan and e-way bill. Yes, because goods sent on job work is not a supply at the time when we are sending it for job work. So as it is not a supply, the document that is required is delivery challan, and e-way bill always required in case of goods sent on job work. Even if goods are directly received by job worker, ITC can be availed by principal. How ITC can be availed by principal? Bill to ship to transactions. When the goods are received by the job worker, the invoice will be raised to the principal. The day on which job worker has received the goods, it is deemed that the principal has received the goods, and the principal can take ITC with respect to that. And see these additional points. Job worker can avail ITC with respect to inputs or input services used for job work. So job worker also will do some process na, so he can take ITC on that. If the processed goods or capital goods are returned by the job worker after 1 year or 3 years, then it will be treated as new supply by the job worker and chargeable to GST, and as you pay GST you can recover that from me and I can take ITC with respect to that. The period of 1 year in case of processed goods and 3 years for capital goods on sufficient cost being shown be extended by the commissioner for a further period not exceeding 1 year or 2 years respectively. And what if job worker is not registered? There is one condition here. If the job worker is not registered, the principal should show job worker's place as the principal's additional place of business. That is one point. If job worker is not registered, principal should declare job worker's place as principal's additional place of business, and jurisdictional commissioner should be intimated about the job work contract, and processed goods may be brought back to principal's place or it can be sold or exported from the job worker's place directly. And every principal who is sending the goods on job work and receiving it from the job work, they need to file one form. What is that? ITC 4. ITC 4. This ITC 4 will be filed on a yearly basis if the aggregate turnover of the principal during previous year does not exceed 5 crores. 5 crores. It does not exceed 5 crores annually. By when? 25th April. So financial year get over by 31st. Na? So 25th of April. Suppose if the aggregate turnover exceeds 5 crores, then it will be 2 times half yearly. Half yearly by 25th of the month following every half year. So first half year is what? April to September by 25th October, and the second half year is what? October to March by 25th of April. So this is about section 19 read with section 143. Okay, and we have this input service distributor. So we'll take a break, and then we will complete this. Okay, fine. Okay, we'll start. So there is one query, 10cc bikes ITC available? Yes, actually ITC available for 10cc bikes, because 10cc bikes will not come under motor vehicles, and as it is not motor vehicles, we don't have any blocked credit. So which means it will be like used in the course or furtherance of business, and ITC is available. So that is about that. Then next, input service distributor, section 20 and section 21 of CGST Act. Basically input service distributor is like a head office. That head office will receive the services and distribute the credit with respect to these services to the branches which are having the same permanent account number as that of the head office. So basically head office will receive the tax invoices with respect to input service. Remember, only input service. Inputs and capital goods credit cannot be distributed this way, only input services. And this ISD, input service distributor, distribute the credit to its branches having the same permanent account number, and this ISD is required to get a separate registration, even though that company is already having, that is each and every branch is having a separate registration. Even then for ISD they need to get a separate registration and distribute the ITC. And here there is one important condition. ISD is say in Tamil Nadu. ISD is in Tamil Nadu and the branch is also in Tamil Nadu. Then CGST credit will be distributed as CGST, SGST as SGST, IGST as IGST. Whereas with respect to registrations in other states, say branch 1, this is branch 1 and this is branch 2 and this is branch 3. Now with respect to branch 2 and 3, so 3 is in Andhra Pradesh. With respect to branch 1, CGST will be distributed as CGST, SGST as SGST, IGST as IGST. With respect to branch 2, CGST, SGST as well as IGST, everything will be distributed as IGST only. Okay, so the ISD which is in Tamil Nadu, with respect to branch 2 and branch 3, with respect to these two branches, CGST or SGST or IGST distributed as what? IGST, distributed as IGST. Whereas to branch 1, CGST or SGST or IGST distributed as CGST, SGST or IGST accordingly. So that is what I have given below. CGST and SGST distributed as CGST, SGST for the unit in the same state of ISD. So ISD is in Tamil Nadu, whereas branch 1 is also in Tamil Nadu. So credit will be distributed in the same manner, same name. And distributed as IGST if the unit is in the different state than that of ISD. So suppose if the unit is in different state than that of ISD, then everything will be distributed as IGST only. Then suppose if the service is attributable only to one branch, entire credit will be distributed to that branch only. If the service is attributable to more than one branch, it will be distributed to those two branches or three branches in the ratio of its turnover. So input service attributable to one unit, entirely distributed to that unit. Input service attributable to two or more units, such two or more units we will distribute the ITC in what ratio? Turnover ratio. Suppose if the input service is attributable to all units, ITC will be distributed to all units which are operational based on the turnover ratio. Now turnover, whether we need to take current year or previous year turnover, we need to take previous year turnover or the last quarter based on the availability. Then how this should be distributed? The ITC should be distributed on a monthly basis, not on a quarterly basis. And for distribution of this ITC, one return needs to be filed, that is GSTR 6 by 13th of the month following every month. And excess distributed ITC can be recovered by issuing a ISD credit note. For example, this ISD has distributed to branch 1 some excess ITC, and to branch 2 and branch 3 there is a shortfall. Now what they can do, excess they distributed now, to reduce that excess distribution, so this ISD can give a credit note to branch 1. That's what they are telling. Excess distributed ITC can be recovered by issuing ISD credit note. Now for branch 2 and branch 3 there is a shortfall. For distributing that shortfall, they can give a ISD invoice. And distributed credit should not exceed the credit available for distribution. Suppose if the ITC available with ISD is 5 lakhs, then while distributing it to these three, the total should not be more than 5 lakhs, means excess credit should not be distributed. If the ISD has distributed excess credit to any one recipient, the excess can be recovered from the recipient with interest. For example, they should distribute 3 lakhs, 3 lakhs and 3 lakhs to these 3 units. But instead what they did, they distributed 4 lakhs, 2.5 and 2.5 to 2 branches. Instead of 3, 3, 3, they distributed 4, 2.5 and 2.5. Now to which unit they have distributed excess? Branch 1 they distribute excess now. From branch 1 the recovery of 1 lakh will be made. So if the ISD has distributed excess credit to any recipient, the excess can be recovered from the recipient with interest. And every ISD should get a compulsory registration irrespective of their aggregate turnover. Then, so we will come across turnover in 3 places. One is Rule 42, common ITC used for both taxable and exempted proportionate ITC available. Then Rule 43, Rule 43 also same, total ITC divided by 60 into exempted turnover by total turnover. Again input service distributor also we come across turnover ratio. Wherever we take the turnover ratio, in the turnover we need to exclude. We need to exclude old indirect taxes. What are they? Excise duty, central sales tax and value added tax should be excluded. Also value of supply of duty credit scrips should be excluded, okay, which means duty credit scrips, even though it is exempted, but it will be excluded from the exempted turnover na. It should be treated as taxable turnover, but this point already I gave there. So you remember only one point. What is that one point you should remember? Old indirect taxes should be excluded. Generally these old indirect taxes will form part of turnover value under 15(2)(a), which says all taxes, duties and cess by whatever name called other than GST should be included in the turnover. Because of that reason, so this should be added generally as per 15 to A. But this is an exception. While determining turnover in 3 places, what are the 3 places? Rule 42, Rule 43 and Rule 40, like section 20. In these 3 places, so turnover excludes old indirect taxes. Then next one, we have a circular on replacement of parts during warranty. So these are some additional circulars which are basically amendments for May 24 exam. So please concentrate, carefully listen. So this circular is basically about purchased goods which are used in replacement during warranty period. So here warranty can be given by the supplier. So whenever there is a like standard warranty or additional warranty, so during that warranty period, if there is any manufacturing defects or etc., so freely the part will be replaced by the supplier. So this is that background. So here issue number 1, Sleek is a modular kitchen supplier. So they have done the interior decoration to Mr. X, who is a customer, for which the customer pays a consideration of 8 lakhs plus GST 18%. This is a normal contract, interior decoration contract. Under this contract, if there is any part which is used in the modular kitchen is damaged, so that will be replaced by this company for a period, usually 6 months or 1 year or 2 years. That will be a warranty period. In that warranty period, they will replace the parts. And now what happened is that Mr. X asked Sleek to replace a part during warranty period, and Sleek will purchase that part for replacement. So parts purchased by Sleek for replacement to customer during warranty period, and the value of that part is 50,000 and GST is 6,000. Now they have replaced that part during warranty period and they did not charge any amount for that. Who did not charge any amount for that? The Sleek supplier did not charge any amount for that. Now the question here is, on the 6,000 can ITC be taken or cannot be taken? First, anywhere we have blocked credits related to this, goods used in warranty period, so ITC is blocked, like that anywhere we learn? No. And is it used in the course or furtherance of business? Yes. So as a business practice, they have to give this assurance to the recipient, then only the recipient will undertake, like receive the services from the supplier. So therefore, as a part of this business only, they do the replacement during warranty period. Means logically they can take ITC, we don't have any restriction. You got it? So reversal of ITC by manufacturer shall not arise, even if such replacement of part is without any consideration. So yes, they can enjoy this ITC of 6,000 rupees. Now, sometimes they charge a nominal amount rather than giving it for free absolutely. So they will charge a nominal amount like 10% or 20% depreciation value, like that they will charge. See, you used for 3 months. Now I am replacing a part new. Then for the 3 months you used now. So for that reason, I will charge some money from you, 10% or 25%, like that I will charge. Now in that case also, is there any restriction with respect to ITC? No, whether you charge or you do not charge, that is irrelevant. And you are using the goods for replacement during warranty period, so happily you can take the ITC. If any consideration is charged with respect to such replacement, then it is supply under 71A. Which is supply under 71A? That money collected, the 10% or 25%, and GST payable on such consideration, but reversal of ITC shall not arise. So what is one point that you need to remember based on this example? If I am purchasing any goods and used it as replacement during warranty period, for that replacement, whether I charge any consideration or not charge any consideration, I can take ITC on the goods purchased. Clear? Then second issue. Issue number 2, you see. So there is a car manufacturer. Toyota is a car manufacturer. Lance and Toyota is a dealer, and they are making sale of car including warranty for 3 years to Mr. X, a buyer. So car manufacturer will sell the car to the dealer and dealer will sell the car including warranty to the buyer. Now in this background, what happened is that, so dealer has paid 12 lakhs plus GST to the manufacturer and they collected 15 lakhs plus GST from the buyer. Why they are getting 3 lakhs? That is their profit margin. Dealer's margin 3 lakhs. Now dealer will provide the service, free after sale service. In this free after sale service, dealer will do service plus even change the parts during the warranty. Got it? Now this services plus part, whether the dealer is really doing it for free or he will get the money, he will definitely get money. From whom he will get the money? Not from the buyer, he will get money from the manufacturer. Dealer will get the money from the manufacturer. So Lanson dealer provided free after sale service of 3000 and replacement of parts 2000. This is the background. Okay. Now in this case we need to understand certain things. First, dealer is procuring the parts for replacement from the third party. Means this replacement of part 2000 is there na. The dealer did not get from the manufacturer, but he purchased it from the market and he used it for free replacement during warranty period and charged consideration from the manufacturer. Now you please step into the dealer shoes. As a dealer, what is that you are doing? First you are buying the part from the market for replacement. Can you take ITC on the part purchased? Yes or no? From dealer point of view, you please interpret. Yes or no? Yes. That already we discussed in the previous point. What is that? If any goods are purchased for replacement during warranty period, whether we charge or we do not charge, we can take ITC on the part purchase. Correct? So on this part of 2000 rupees, whatever GST is paid, as a dealer you can take ITC on that. Done. Second point. Now you are incurring 5000 rupees. What you will do? 5000 rupees you will incur out of your pocket or you will charge it to manufacturer? You will charge it to manufacturer. On that, will you pay GST also? Yes. And in turn you will recover it from the manufacturer. You got it? So see the dealer's perspective. First, invoice for recovery of cost from manufacturer, 3000 after sale service, replacement of part 2000, total 5000, GST 18%, so 5900. Now dealer will pay this 900 rupees to government. Then on parts purchase, 2000 into 18%, 360, ITC is available to the dealer. And whether any reversal of ITC? No. Even though you are doing it for free or you are charging, you can enjoy the ITC of this 360. No reversal of ITC required by the dealer in case of replacement of parts. This is from the dealer's perspective. Now, from the manufacturer point of view, we will see. So, as a manufacturer, now step into the shoes of a manufacturer. Now, what you are doing? You are paying 5900 rupees to the dealer, correct? Now, can that 900 rupees be taken as ITC by you? Yes, because dealer will raise invoice to you and you can take ITC with respect to that 900. That is simple. Manufacturer shall pay 5900 to the dealer and ITC of 900 can be claimed by the manufacturer. So, you tell me, this is example. From this example, you should remember the provision. I have not given the provision directly because if you read the provision directly, nothing you will understand. That's why through numbers I am making you understand. So now tell me, what is the treatment when the part is procured from the third party? As a dealer, dealer will recover the charges from the manufacturer and GST will be payable on those charges recovered, and on the parts procured ITC can be availed. And as a manufacturer, manufacturer will pay the charges to the dealer and on the charges GST ITC can be availed by manufacturer. Then second situation, same scenario, question is same. Scenario 2, situation 2. What happens in situation 2? If replacement of parts are received by dealer from the manufacturer, so means what happens here? That part dealer is not procuring. Dealer is not procuring that part. That part dealer got it for free from the manufacturer. Okay. And the dealer has used it in the buyer, which means as a dealer, how much you will recover from the manufacturer? 3000 or 5000? 3000. Why you will recover only 3000? Because part you got it for free from the car manufacturer. So to the car manufacturer, you raise a bill for 3000 plus applicable GST and you will pay that GST. As you did not procure the part, so the question of ITC does not arise. So see that as a dealer, you will raise invoice to the manufacturer 3000 rupees after sale service, GST 540 and invoice value 3540 and you will pay 540 rupees to government. Now you tell me, as a manufacturer, what you will do. So as you procured the part freely, you have given to the dealer, but you would have procured the part as a manufacturer, on that part procured, so you can take ITC, yes, because you are using that part for what purpose? Free replacement during warranty period. As a manufacturer, you can enjoy the ITC on that part procured, and even dealer will raise invoice to you for that 3000 rupees plus GST, that 540 rupees can be taken as ITC. So see that manufacturer shall pay 3540 to the dealer, and ITC of 540 can be claimed by the manufacturer with respect to after sale service. Then 2000 into 18%, sorry, you just change this to 360. 2000 into 18%, that is 360 rupees. What is this 360 rupees? GST paid on the part purchase. GST paid on the part purchase, so can be taken as ITC. And any reversal of ITC required by the manufacturer? No, not required. Now you tell me, what is the treatment of this as a provision? What is this situation? So parts are procured by the manufacturer and given it for free to the dealer. In that case, can the ITC be enjoyed by the manufacturer? Yes. And whenever dealer raises the invoice for free after sale service, on that GST paid can be taken as ITC by the manufacturer. Dealer will simply pay GST on whatever money that he has recovered from the manufacturer, and dealer will not purchase the part. So the question of ITC does not arise. Now, third situation. Listen, what happens in this third situation is that 100 numbers of spare part is supplied by the manufacturer to the dealer at 2000 rupees, excluding GST at 18%. So these parts are for sale. Basically, these parts are for sale. Manufacturer will send it to the dealer for sale parts, but the dealer, out of these 100, one part he has taken and used it for replacement during warranty period, which means dealer is required to pay to manufacturer for 100 parts or 99 parts, only 99 parts. Why 99 parts? Again I am replying, again I am discussing this, concentrate. I am a manufacturer, you are my dealer, I am sending you 100 parts. I will raise invoice for 100 parts to you, but you will pay me for 100 parts or 99 parts, only 99 parts. Why not 100 parts? Because one part you are using it for replacement during warranty period, and for which you are not required to pay me money, correct or not? Which means first I will raise as a manufacturer to you invoice for 100 parts. Thereafter I will give you credit note for one part, because you are not required to pay money for that. You got it? Now, as a dealer, first you procured 100 parts and you availed the ITC, and as you got the credit note, you need to reverse the ITC. Got it? This is related to that parts. Over, job done. Now, how much you will charge to the manufacturer for after sale service? 3000. So into 540 rupees, that I will take as ITC. Okay. So say this first from the dealer point of view. Situation 3, 100 numbers of spare parts supplied by manufacturer to dealer at 2000 excluding GST. Out of that, one spare part is used as replacement during warranty period. So the dealer will pay 2,36,000 to manufacturer first. Why? Because manufacturer will raise invoice for 100 into 2000, 2 lakhs, and GST 18%, 2,36,000. And in that 2,36,000, ITC dealer will take 36,000. Now, one credit note will be given to the dealer. So ITC must be reversed by dealer based on credit note. So if 100 parts GST is 36,000, for one part it is how much? 360. That 360 needs to be reversed. Then as a dealer, you will raise invoice to the manufacturer for 3,540 and you will pay GST of 540. This is the job in the hands of dealer. Now in the hands of manufacturer, what will happen? Manufacturer will first raise invoice for 100 parts na, 2 lakhs plus 36,000, and one credit note will be given for reducing that, and dealer will raise invoice for 3,540 to manufacturer, and 540 can be taken as ITC by the dealer. Okay. Actually, this is given in pure English. In the circular, they have given a circular related to this, and in that circular, they have given fully about this, in English, which we cannot read and comprehend. Even in exam also, they will not test whatever you learnt in circular, you write like that, they will not ask a question. So they will convert it into numbers like this. So that's why this will be useful. So just literally like this only they can ask questions on this. Then next, another issue. Issue number 3. This is related to, usually warranty, we pay additional amount for warranty. If you pay that additional amount for the warranty at the time of purchase of the product itself, what is the GST rate applicable for this additional warranty? At the time of purchase of the product itself, you pay for warranty. Whatever is the GST rate applicable to the product, that should be taken for additional warranty also. Suppose if you buy the additional warranty separately, not at the time of purchase of the product, then for the warranty, the general rate 18% will be applicable. For example, iPhone 15 Pro Max 1,59,900, say rate of GST 28%. And coverage is there. Usually extra money you have to pay for the coverage, Apple Plus coverage, 15,000 inclusive of GST. Now this 15,000 is taxable at what rate of GST? Now if the coverage is taken at the time of purchase of iPhone, this 15,000 will be taxable at 28%. If the coverage is taken at a later point of time, then this 15,000 will be taxable at what rate? 18%, because it will be treated as a separate contract. Then another circular is related to cross charge. So it's not gross charge, it is cross charge. In this alphabet it's cross charge, it's not gross charge, cross charge. So what is this cross charge means? Cross charge means one office will raise invoice to the another office. It can be head office or branch office. So ISD opposite is cross charge. So either we can distribute the credit based on ISD concept, or we can also follow the cross charge. It's like head office. Head office is there, and below the head office we have branch office 1, branch office 2 and branch office 3, and there is a supplier, and this supplier will raise invoice to the head office, and the head office will avail ITC, and this ITC will be distributed to all the 3 branches. So this is the concept of input service distributor. Okay. Now here what is the disadvantage in this ASD? They should distribute it in turnover ratio, correct? Distribute in turnover ratio. Now I don't want to follow this. Instead I want to make it simple. That is, the supplier will raise invoice to branch office 1, and the branch office 1 will raise invoice to branch office 2, branch office 2 will raise invoice to branch office 3, or branch office 1 will raise invoice to branch office 3. So I just wanted to structure it that way. So branch office 1, branch office 2, branch office 3. Now I want to eliminate this concept of ISD. So the supplier will raise invoice to branch office 1. Now branch office 1 will take ITC availed, full ITC. Now branch office 1 will raise invoice to branch office 2 and branch office 3. Invoice they will raise. You got it? And this concept is known as cross charge. This is known as cross charge, whereas this is known as input service distributor. Okay. So but both cases the objective is achieved. All the 3 branches are taking the ITC. Now based on this invoices, so here branch office 2 will take ITC availed, and even branch office 3 will avail the ITC. You understood? Whereas in ISD also the objective is same, all the 3 branches, so distribution of ITC, so 3 branches will also take the ITC. Now should I follow ISD or cross charge? Circular says anything you follow. Either you follow ISD or you follow cross charge, but ensure that in cross charge this service is not attributable to only one division. The service is really attributable to other divisions also, then you do this. But what is the advantage we can achieve in this cross charge? Turnover ratio we don't have to follow. Got it? Turnover ratio turnover ratio need not be followed. Need not be followed. Okay. Now, this particular circular will be applicable only for May 24 exams. Reason being, they gave Finance Bill 2024. As per the Finance Bill 2024, they are telling that this cross charge should not be followed, ISD only should be followed. Previously, ISD only should be followed. Circular gave either cross charge or ISD you follow. Again, Finance Act 2024, they are telling follow ISD only. Okay. So, then, Parchimoto Gordon Lirkla. So, therefore, why they change that, I don't know. But this circular is applicable only for your exam. Okay. What is that? Either ISD or cross charge can be followed by head office for distribution of credit to branch office. In case of cross charge, normal invoice is raised by head office to branch office. Turnover ratio need not be followed, but those services should be attributable to branch office. Okay. And even in case of cross charge, separate registration not required. That head office, one separate registration we used to get, that is also not required. That all those things are only for ISD, not for cross charge. Then, now one more point they have given in the circular related to internally generated services. See, with respect to services procured from the third party, either they can follow ISD or they can follow cross charge, no doubt. But with respect to internally generated services, what is this internally generated services means? Branch office HR function is taken over by the head office. Means head office or corporate office is only looking after the HR of all the branches, because HR they will make centralized. They will not do separately. HR, finance, marketing and sales, these things and all, they will make it like a common. They will not give it separately for each and every branch. If that is the case, then good, one chartered accountant can be appointed for one branch. So, but usually finance and all, they will concentrate only in the centralized location. Now, in that case, what happens is that head office will incur the expenses even for the branch office also, and will raise a debit note for recovery of the expenses, common expenses. This only we call as apportionment of overheads. Common overheads we will apportion between the divisions. So, head office will incur the common services, they will incur the expenditure. And how they will recover the expenditure? By raising the debit notes to the branches, they will recover the expenses. Now, what is the treatment of that recovery of expenses? This is not procured from the third party. This is internally generated. What is the treatment of that? Services provided by head office to branch office, not procured from the third party, internally generated. Now, this will come under transaction between distinct persons. In case of transaction between distinct person, head office is one distinct person, branch office is one distinct person, and the value needs to be determined under Rule 28. We have Rule 28 of valuation rules, which says that you take either open market value or like kind and quality or cost plus 10%. If the recipient is eligible for full ITC, the open market value is nothing but the transaction value. Okay. Now see that. Is branch office eligible for full ITC or branch office not eligible for full ITC? If branch office is eligible for full ITC, whether amount recovered or not from the branch office by head office, value under Rule 28 is nothing but invoice value. Why? Open market value deemed to be transaction value. You can write that. Open market value deemed to be transaction value. Because of that reason, even value can be taken as nil also, no issue. Suppose if branch office is not eligible for full ITC, then we need to determine the open market value. Amount recovered from branch office by head office, open market value should be taken. What if open market value not available, like kind and quality or cost plus 10%, that will come. What if amount not recovered from branch office? even then open market value should be taken. But this is exception to rule 28. What does they are telling? No value of taxable supply. So this is exception to rule 28. Actually rule 28 says whether consideration is there or not. Sir, if the amount is recovered, it will become supply under section 71A. If the amount is not recovered, it will become supply under section 71C. Whether it is supply under 71A or 71C, transaction between distinct persons, the value will be as per rule 28. As per rule 28, if the value is open market value, only should be taken. But in this case, when the amount is not recovered from the branch office by head office, the CBIC circular says that you don't have to take any value. Okay, so value will be taken as 0 and no need to pay GST. This is an exception which they have created in the circular. Okay, so these are the amendments that we have in input tax credit. With that, we have completed ITC. So we will see the next area, that is value of supply. So please take value of supply. What's the page number? Page number 71. So value of supply, we don't have any amendments. It is the same old story, and except for in rule 28, one corporate guarantee provision they have changed, otherwise everything will be same. So section 15 deals with the value of supply. What does section 15 say? Section 15 subsection 1 says value of supply is nothing but the transaction value. What is transaction value? Price actually paid or payable. And this transaction value will be taken as value or assessable value provided two conditions are satisfied. Condition number 1, price must be the sole consideration, supplier and recipient are not related. Both these conditions should be satisfied. If any one condition is not satisfied, transaction value not applicable, and we need to determine the value as per rules. And for this transaction value, we have some inclusions as per 15 subsection 2. What does it say? So first, supplier will supply the goods or services to the recipient, for which recipient will pay some money. That amount which is paid by the recipient will be taken as transaction value. 15(2)(a), total 5 inclusions we have. The first inclusion is taxes, duties and cess by whatever name call other than GST. So that is any tax other than GST, if charged by the supplier to the recipient, it should be included in the value. For example, so entertainment tax which is collected by the cinema theatre from the audience. So price of the ticket say 190 rupees, entertainment tax somewhere like 30 rupees. So now while computing the GST, whether entertainment tax should be added or not, yes, we need to add. Same way, at the time of import of goods, we need to compute the customs duty. While computing the customs duty and IGST, so IGST should be computed even on customs duty component also? Yes. So a value of goods imported plus customs duty, on that IGST should be computed, which means that for computation of GST, all taxes, duties and cess by whatever name call other than GST should be included in the value. That is this. Any tax other than GST should be included in value. Then 15(2)(b), recipient is incurring some expenditure on behalf of the supplier. That expenditure should be included in the value. This is like, say, supplier is liable to pay some money. For example, I am a finished goods manufacturer and I have procured some raw material for 4,000 rupees. Now I need to pay that 4,000, but I asked you to pay the 4,000 and pay 6,000 rupees to me. So 6,000 rupees will be transaction value plus 4,000 which you paid to my raw material supplier on behalf of me is like any amount that the supplier is liable to pay but incurred by the recipient should be added to the value. So that 4,000 should be added. So the value will be taken as 10,000 rupees. That is about 15(2)(b). What if recipient is incurring the expenditure on his own account? Will that expenditure be included in the value? No, it will not be included in the value because it is expenditure incurred by recipient on his own account. Example, transportation charges. The sale is a ex-showroom sale. Ex-showroom sale means my sale is completed the moment I hand over the product in my showroom. Thereafter, you should only incur the transportation cost. Now you incur the transportation cost. Will it be included in the value? No, because expenditure incurred by the recipient on his own account, that will not be included in the value. Then 15(2)(c) says, if supplier is incurring any expenditure and recovers from the recipient, then it should be included in the value. But here we need to check, is that expenditure incurred by supplier and recovered from recipient as a pure agent of the recipient? If it is supplier acting as a pure agent, don't include that expenditure in the value. So we need to check whether it is as a pure agent on behalf of recipient, such expenditure shall be excluded from the value. When supplier will act as a pure agent of the recipient, firstly, it should be the liability of the recipient, which is incurred by the supplier, and supplier should satisfy certain conditions. What are those conditions? Number one, there should be a written agreement between the supplier and the recipient, where supplier is acting as a pure agent, recipient should authorize the supplier to act as a pure agent to incur the expenditure. So first condition, contract. You can see in the next page, conditions for pure agent. Supplier should enter into an agreement with the recipient, and supplier should recover only the actual amount incurred. Means supplier should not make profit out of the transaction. Supplier should not hold the title of the goods or services so procured. Means the invoice should not be in the name of the supplier, the invoice should be in the name of the recipient. And supplier should not use the said goods or services so procured for his personal purpose. Now, example, there is a chartered accountant who is doing the income tax filing of a client, and the chartered accountant incurred the income tax liability of the client and recovered the filing fees as well as income tax paid on behalf of client. Now, in this case, whether pure agent point will be applicable or not, definitely it will be applicable. Firstly, income tax liability is the liability of the client, that is recipient. Who incurred it? Supplier has incurred. Now check the condition number one, whether the recipient is authorizing the supplier to incur that expenditure. Yes. Number two, whatever is the actual expenditure of income tax, that much only is recovered. And the income tax receipt definitely will not be in the name of chartered accountant, but it will be in the name of client. And it is not the chartered accountant's income tax liability he recovered. So therefore, it is not used for the personal purpose of the supplier. Due to that reason, supplier acts as a pure agent. And in this case, filing fees 10,000, income tax 5,000, 15,000 recovered, but GST payable only on 10,000. That 5,000 income tax liability, which is of recipient, supplier incurred as a pure agent, and it will be excluded from the value. Got it? So when you need to apply pure agent concept, first you need to check, is that expenditure the liability of the recipient? Number two, incurred by the supplier. Number three, supplier is acting as a pure agent. Okay. So when the supplier is acting as a pure agent, for the third point, 4 conditions. So when the supplier is acting as a pure agent, first, agreement. Through an agreement, recipient should authorize the supplier. Second, the title should not be in the name of the supplier. Number 3, only the actual amount should be recovered, and it should not be used for the personal purpose of the supplier. Then, suppose if it is not a pure agent, it will be in the course of supply, and that expenditure should be included. For example, door delivery contract. In door delivery contract, what will happen? Supplier will undertake to deliver the product to the recipient's location. Now, supplier will incur the transportation cost. This transportation cost should be included in the value or not? Yes. Expenditure incurred by the supplier and charge it to recipient other than as a pure agent. So that should be included in the value. That is about 15(2)(c). 15(2)(a). First, value equals to transaction value if 2 conditions are satisfied. Supplier and recipient are not related and price must be the sole consideration. 5 inclusions. In that 3 inclusions we have seen. 15(2)(a), any taxes, duties and cess by whatever name called other than GST, and first one is recipient incurring expenditure. Recipient incurs expenditure on behalf of supplier, that should be included in the value. The next one is supplier incurring the expenditure and charge it to recipient. Divide into 2. Pure agent, it will not be included. Otherwise, as a pure agent, it will be included in the value. Then 15(2)(d) talks about interest, late fee or penalty for delay in receipt of consideration. That is, whenever supplier has to get the money from the recipient, but the recipient has not made the payment on time, because of which supplier will be collecting some interest from the recipient. This interest is known as interest on account of delay in receipt of consideration. that should be included in the value and chargeable to GST. So basically interest will come in two places in GST. One is interest on loans, advances, deposits, which is exempted, no need to pay GST. Whereas interest on account of delay in receipt of consideration, it should be included in the value and chargeable to tax accordingly. Include in the value means, so if the invoice is taxable, this interest also taxable. If invoice value is exempted, this interest also exempted. Means this interest is not treated as a separate activity. This interest will derive the character of the invoice for which this interest is collected. Okay. Then that is with respect to this 15.2d. Then 15.2e is about subsidy. Subsidy is basically an amount which will be collected from one person, and this subsidy is not arising out of any contract. It is like a grant which is given by one person to the another person, and these grants may be with certain objectives or it may be out of gratitude. Anyway, it can be given. So subsidy basically divided into two. Is it directly linked to price or not directly linked to the price? What is the meaning of not directly linked to the price? Means subsidy is no way connected to the outward supply. Whereas if the subsidy is connected to the outward supply, it is called as directly linked to the price. If I am selling a electric motor vehicle, so I will get a subsidy from central government 10,000 rupees per two-wheeler sold. So this 10,000 rupees per two-wheeler sold is directly linked to the outward supply, correct? Directly linked to the price. For every two-wheeler sold, I am getting 10,000 rupees. Means it is directly linked to price. Recently also, if you are installing a panel, that is the solar panel, you will get a subsidy from the government. Is it related to your outward supply? No. It is general subsidy. For installation of a solar panel, they are giving this. This is not linked to outward supply. Means it is not directly linked to the price. So directly linked to the price means subsidy based on outward supply. Not directly linked to the price means subsidy irrespective of the outward supply. If the subsidy is general subsidy, example, to set up a power plant or to set up a green energy plant, to set up a solar plant, you are receiving some money. So this money received will be called as general subsidy. That general subsidy should be ignored. It should not be considered for valuation purpose. Ignored and not considered in value, you treat it like a donations. Whereas directly linked to the price, that is subsidy based on outward supply. So is it from central government or state government or is it from others? If it is from central government or state government, to be excluded from the value. Suppose if it is from others, to be included in the value. Now, how we need to understand this particular implication? Now, say for example, the price, there is a coaching center. There is a coaching center, and this coaching center is getting three revenues. From student they are getting 10,000, and from central government they are getting 3,000. From NGO they are getting 2,000. What should be taken as the value of supply? So this 10,000 will be taken as the transaction value, and this 3,000 rupees from central government, will it be included in the value or not included in the value? Not included in the value, because subsidy, both are directly linked to the price. Because 3,000 per student, 2,000 per student, you understood? Directly into the price. But subsidy from central government or state government, not included in the value. But subsidy from an NGO to be included in the value. Therefore, what will be taken as the value of supply in this case? The value of supply in this case will be 12,000 rupees. Okay. Now, problem is whether this 10,000 rupees is inclusive of 3,000 and 2,000 or non-inclusive of 3,000, 2,000. That's the confusion where we will be getting. It is very simple concept only. So, subsidy from CGST don't include. Subsidy from others you include. Okay. And if it is not directly linked to the price, you ignore it. But the problem is whether the price is considering subsidy or without considering the subsidy. In this case, this 10,000 rupees is without considering subsidy. Sorry, considering subsidy. After considering subsidy. After considering subsidy. What is the meaning of after considering subsidy? Means the coaching center knows that they will get 3,000 and 2,000 from others. So they would have reduced it from the original price and they would have collected only 10,000 rupees from the student. means the given price is based on original price minus subsidy. That is the meaning of considering subsidy. After considering subsidy means the given price. What is the given price? 10,000 is after reducing subsidy, means there is a original price. What could be the original price? 15,000 could be the original price. From 15,000 they reduced 3,000 and 2,000 and they got given price 10,000 rupees. Now what we need to do in that case? In that case first we need to take transaction value. So what is the transaction value? Transaction value is 10,000 rupees. Now subsidy from CG. Subsidy from CG. As per provision, subsidy from CG to be included or to be excluded? To be excluded. In the given price it is already excluded. See this minus subsidy, already it is excluded. So therefore ignore. Got it? So as per provision, to be excluded. To be excluded as per section 15(2)(e), and in the given price it is already excluded. So what you need to do? Ignore, don't consider. Okay. Then subsidy from NGO. Subsidy from NGO. Subsidy from NGO, as per provision it is to be included, but in the given price it is excluded. We excluded it. So therefore we need to add. So to be included as per section 15(2)(e), and in the given price it is excluded. So what you should do? You should add. How much is that? 2,000. Now you will get the transaction value, the assessable value. The assessable value or value of supply. So that value of supply will be 12,000 rupees. So this is how we need to do. Now sir, what if the given price of 10,000 is without considering subsidy? Then how it will change? If given price of 10,000 is without considering subsidy. What is the meaning of without considering subsidy? Without considering subsidy means the original price itself is the given price. The given price itself is the original price, means they have not reduced any subsidy. They have not reduced any subsidy. Then in that case what will happen, sir? Then same story. First transaction value you will take, and transaction value under section 15 subsection 1, that will be 10,000 rupees, and subsidy from whom? First CG. Subsidy from central government to be included or to be excluded? To be excluded. And in the given price what we have done? Not excluded. So therefore we need to deduct. Okay. So subsidy from CG to be excluded, and in the given price it is not excluded. So what you should do? Deduct. So we have to reduce that 3,000. Then next, subsidy from NGO. Subsidy from NGO, it is to be included, and in the given price already included. When it is already included, again are you required to do anything? No, simply ignore. So therefore value of supply will be 7,000. So this is how the answer will change accordingly based on which assumption we need to take. Sir, if the question is silent, which assumption I should take? So just take the assumption as price after considering subsidy. That point I have given there, you can see. Note, if the question is silent, consider the given price as after reducing the subsidy amount given in the question. That is, original price minus subsidy is the given price. That's how we need to take the assumption there. Then this conditions for pure agent already we have seen. Now there is one point related to pure agent: passenger service fee and user development fee. Usually airport operators, Airport Authority of India or any airport operator, they will be providing access to the airport to the passengers, for which they will be collecting PSF, passenger service fee, or UDF, user development fee. But this fee they will not collect from the passenger, they will collect from the airlines, and at the time of booking the ticket, airlines will collect it from the passenger. So airlines will pay UDF or PSF to the airport and will recover it from the passenger. So whether this UDF and PSF will be included in the value of the ticket for computing the GST? No, basically this UDF and PSF will come as a pure agent expenditure. Actually it is whose expenditure? Passenger's expenditure. Who is paying? Airline is paying and recovering it from the passenger. And moreover here, so passenger authorizes the airline to incur that expenditure, and the title is not in the name of the airline, and only the actual amount incurred they are recovering. So it is not the personal expenditure of the airline. So therefore pure agent will be applicable, and while computing the GST on the ticket fare, this UDF PSF which the airline is collecting from the passenger should not be included. See there, passenger service fee and user development fee collected by airline operators from passengers are to be remitted to airport operator and falls under expenditure incurred as a pure agent, and it should not be included in the value. Then exclusions from the value of supply as per 15 subsection 3. So far we have seen inclusions, 5 inclusions, and we have exclusion only one, that is discount. So discount is divided into 3. Discount given before or at the time of supply, is it allowed as reduction? Yes. So discount given before at the time of supply, it will be duly recorded in the invoice, it will be allowed as deduction. For example, 10,000 rupees is the product price and I am giving 3,000 rupees as a discount. Now GST will be payable only on 7,000, 10,000 minus 3,000, 7,000 only GST payable, there is no confusion in that. Whereas if the discount is given after supply, so pre-supply discount always allowed as deduction. Post-supply discount means what? Discount given after supply. But they are telling whether conditions are agreed before at the time of supply or not, you check. If conditions are agreed before at the time of supply, then in that case supplier can give a credit note to the recipient, because of which the liability of the supplier will get reduced and the recipient will reverse the ITC. So what is the need of credit note and debit note? Whenever the invoice value increases, basically credit note and debit note is given by supplier to recipient, and the recipient shows what balance in supplier's books? Debit balance. So when the debit balance increases, the name of the document is debit note. When the debit balance decreases, the name of the note is credit note. Now sale invoice given, so recipient will show a debit balance. Now a credit note to be given. Why? Discount. Now when I am giving a discount, what I will do for discount? What is the entry that I will pass in my book, supplier books? Discount, discount allowed account debit to recipient account, means recipient I am crediting na. Due to that reason the name of the document will be credit note. And when credit note is given by supplier to recipient, because of the credit note, the liability of the supplier gets reduced, and even the recipient should reverse the ITC with respect to that. Okay, and that is this. Credit note allowed as deduction, credit note shall be issued and recipient should reverse the proportionate ITC. This is in case of post supply discount. Example for post supply discount is cash discount. Suppose if it is a post supply discount and the terms are not agreed before at the time of supply, example end of season sale discount, will it be allowed as deduction? No, it will not be allowed as deduction, which means GST will be payable on entire value before discount. I gave you goods worth 1 lakh and thereafter I gave you a post supply discount of 40%, means you will not pay me 1 lakh, you will pay only 60,000. But this post supply discount terms are not agreed before at the time of supply, consequently it is not allowed as deduction, which means I need to pay GST on 1 lakh or 60,000? 1 lakh. Even though I collect 60,000, I should pay GST on 1 lakh rupees. That is with respect to this. Then next one, whether GST is applicable on additional or penal interest on the overdue loan. So basically if you are not repaying a EMI, so there will be a penal interest that will be charged. Now In the TMI, whether the interest is taxable or exempted, you check. If the interest involved in the EMI is exempted, the penal interest for non-payment of the EMI is also exempted. If the interest involved in EMI is taxable, the penal interest for non-repayment of the EMI is also taxable. For example, housing loan you have taken. Housing loan EMI interest is exempted because that will come under interest on loans, advances, deposits. As the interest in housing loan is exempted, housing loan EMI is exempted. So for non-payment of the EMI, one penal interest is charged, that penal interest is also exempted. Whereas credit card EMI, so is taxable. Interest involved in credit card EMI is taxable. So when you swipe the credit card and convert into EMI, there will be interest component in the EMI. That interest will be taxable. We don't have any exemption. And non-payment of this credit card EMI, they will be charging a penal interest. That penal interest will be taxable or exempted. That will be taxable. So you need to remember, if the interest involved in EMI is exempted, penal interest also exempted. If the interest involved in EMI is taxable, penal interest is also taxable. So hire purchase transaction. In hire purchase transaction, there will be a EMI. So hire purchase transaction, there will be two parties, hire vendor and the hire buyer. So hire vendor will give the asset on hire purchase, for which the hire purchaser, hire buyer or purchaser will pay the EMIs. This interest is on account of delay in receipt of consideration. So interest involved in this EMI will be taxable. In which EMI? Hire purchase transaction EMI or hire purchase financing EMI? Hire purchase transaction EMI. So non-repayment of this EMI interest, penal interest will come. That penal interest is also exempted. Whereas in hire purchase financing, what will happen? There will be three parties: hire vendor, hire purchaser, and one financier will be there, like Bajaj Finance, etc. Now in that case, the financier will recover the EMI from you. So in the TMI, the interest is exempted because it will come under interest on loans, advances, deposits. For non-payment of this EMI, there will be a penal interest that Bajaj Finance will charge. That interest is exempted. As the main interest is exempted, penal interest is also exempted. Now that's where many people, instead of calling it as penal interest, they will be calling it as bounce charges or finance charges, etc. for non-payment of EMI. Whether these charges will be taxable? Yes. Be careful in the question whether they are using the word penal interest or finance charges. If it is finance charges, example, same Bajaj Finance, EMI, if you are not missing a EMI, if you are not paying a EMI, instead of levying penal charges, they call it as EMI bounce charges. EMI bounce charges, even though the interest involved in the EMI is exempted, but these EMI bounce charges will be taxable. Why, sir? Because it is not penal interest. Only penal interest is exempted, but not any other charges. The other charges and all will be taxable. You got it? So this logic of penal interest is only for penal interest, okay, not for other charges. So that is about this. Then next point, you see, treatment of inclusions or exclusions in the given price. What we should check is that, first, as per provision, whether an amount is to be included. Example, so there is a packing charges. Packing charges included or not? Yes. Packing charges is an expenditure incurred by supplier and charged to recipient before delivery of goods. So definitely the packing charges should be included in the value. But in the given price, it is already included. So what is the treatment? Ignore. Already it is included. Don't add it again. Second, an amount is to be excluded as per provision. Example, so discount, pre-supply discount should be excluded as per provision. But in the given price, it is already excluded. Means the given price itself is after discount. Whether you need to deduct it? No, ignore. An amount is to be included. Example, transportation charges. Transportation charges incurred by the supplier and charged to recipient. So to be included. In the given price, it is not included. So what you should do? You need to add. Then an amount is to be excluded. Example, subsidy from central government or state government to be excluded. In the given price, it is not excluded. Means you need to deduct. Okay. So then, see, next 2 points will complete with this. 2 points you see, whether no claim bonus given by the insurance company to the insured can be claimed as deduction while computing the value of supply. So here, what is this no claim bonus? No claim bonus is like whenever insurance company, you have taken a general insurance. There is no concept of no claim bonus in life insurance. Okay, in life insurance you cannot say I will not claim, I will die this year, again next year I will be born, I will take. No, there is no concept. So usually in case of general insurance only there is a concept of no claim bonus, and if you are not lodging any claim in the last year, this year while paying the premium, so you will get a reduction. That is what no claim bonus is. Basically this no claim bonus is like a deduction, pre-supply discount, because we will know this no claim bonus at the time of paying the premium itself, and in the invoice it will be duly mentioned that this is the premium minus no claim bonus, this is the net premium that you need to pay. So it is like a pre-supply discount and it is allowed as a deduction. That is this. Whether no claim bonus given by insurance company to insured can be claimed as deduction while computing the value of supply. Yes, provided the same is shown in the invoice, it is allowed as deduction, because basically it is like a pre-supply discount. Then another circular you see. Usually for these low value UPI transactions, what is low value UPI transactions? Up to 2000 rupees, up to 2000 rupees, low value UPI transactions or Beam UPI transactions or RuPay debit cards. In that case, the people that is acquiring banks will not be charging any processing fee. For C2C, there is no processing fee at all. C2C, consumer to consumer. For example, I am transferring amount to you in GPay, so there is no problem there. So there is no processing fees at all. But B2B and B2C, there is processing fees. For example, you are purchasing a book or you are making some fees to us. So now you will pay using scan and you will make payment. Do you think there is no charges? No, there is charges. There is processing fees. But if it is a low value transaction up to 2000 rupees, there won't be any charges. Why there won't be any charges? Because the acquiring bank like Paytm or PhonePe or etc., these people get an incentive from Ministry of Electronics and Information Technology. So because this UPI platform is developed by Ministry of Information Technology and Electronics, so this incentive received from them is like subsidy from central government or state government, and that should not be included in the value and not chargeable to GST. Is it clear? Read there. Whether incentive paid by Ministry of Electronics and Information Technology to acquiring bank under the incentive scheme of RuPay debit cards and low value UPI transactions. So it is considered in the nature of what? Subsidy by central government, and therefore it will not be included in the value. Okay. So these are the points related to value of supply, and then we have rules related information that we will see in the next class. Okay. So this is about today's discussion, and so tomorrow we will see value of supply, the remaining portion, and as I said, a composition scheme that we will be completing, and even I will take exemptions and RCM. So that is the agenda for tomorrow. Okay. Thank you. So there is one query. In situation 2, how it will affect the manufacturer turnover supply of spare parts for without consideration? It will not be a supply. So manufacturer who is sending the spare part free of cost to the dealer, one example we saw na, will it become supply in the hands of manufacturer or not a supply? Not a supply. Because to become supply, 71C should get attracted. So that 71C will come or will not come. Manufacturer purchasing the part and ITC availed on that part. Manufacturer give the part free to the dealer. You understood? Situation 2 we saw na here. Is it supply or not a supply? It is supply. Disposal of business asset on which ITC is availed. So it will become supply and it will be added to his turnover. Okay. Whose turnover? Manufacturer's turnover. Okay. Then next. In the warranty case 3, is it not simple to treat the transaction as independent, pay for 100 components and charge the manufacturer for that one part used for warranty? We can do that, but in the business practice what will happen? Manufacturer will be sending the parts to the dealer and they don't know which part will be used for free warranty and which part will be used for sale. And logistics. The problem is logistics. For one part, we need to send a courier. Instead of sending a courier for one part, anyhow we are sending at regular intervals parts, so manufacturer will be sending it. So practically that's how it happens. Okay. And tomorrow class timings will be from 10 to 6. That's regular time. So no change in that. Tomorrow, day after tomorrow, that's regular time only. Okay. And please upload only amendment lecture separately. So let me do here, because see, you have to think about my situation also. Just because you cannot attend the revision lectures and you want amendments only separately, so from my point of view also you think of same thing I have to repeat again. I am also human being only now, I am not a mission, and I am going every time extra mile and doing benefit for the sake of students. Just because some person is doing, you should not take things for granted. Little bit have a feeling for me also. First you attend these revision lectures. If time permits, I will do, otherwise I cannot. Okay, please try to understand. Okay, yes, thank you. So we were into the discussion related to value of supply. In that we have seen section 15, and now we are looking into summary on IGST rules related to valuation. So you can see this, when these rules are applicable mainly when, so price is not the sole consideration or supplier and recipient are related. So first rule 27 we have. What does rule 27 says? When price is not the sole consideration, means consideration is partly in money and partly in other form, or consideration is in non-monetary form. Then in that case, rule 27 will be applicable. Then when 28 is applicable, in case of transaction between related parties, including distinct persons, rule 28 is applicable. And rule 29 is applicable in case of principal agent transactions. So this information is in page number 73. So first, so three rules are there, rule 27, 28 and 29. 27 is when price is not sole consideration. 28, related party transactions including transaction between distinct person. 29, principal agent transaction. First we are seeing rule 27. It says that, so when price is not sole consideration, you please take the open market value. So if open market value not ascertainable, the first priority is open market value. If that is not available, then only we need to take money received plus money value of non-monetary consideration. So suppose if this is also not available, why this is not available? Money value of non-monetary consideration is not available, then we need to take like, kind and quality. Like, kind and quality also not available, then rule 30, which says that we need to take cost plus 10%. So when we are taking cost plus 10%, so below in note 2 I have given, so what should be taken as the cost? The cost will be in case of manufacturer, cost of production. In case of a trader, it is cost of acquisition. In case of service provider, it is the cost of providing the service. Suppose if I am a manufacturer and I am giving it to a person where I am getting partly in money and partly in non-monetary form. Now open market value not available. So and price, money received plus money value of non-monetary consideration. I got some non-monetary consideration from the recipient. So that also not available here. So like, kind and quality also not available. Then what I will do, I will take cost of production, add 10% or into 110%. Anyway, you can remember, and that will be taken as a value for payment of GST. And here, what is the difference between open market value and like, kind and quality? So first we need to check open market value. If not available only, so then the second, money received plus money value of non-monetary consideration, if that is also not available, then like, kind and quality. What is the difference? So OMV and LKQ. Comparable time, if you see, for OMV it is the same date. Open market value, it is the same date, which means that today, what is the price at which the transaction has happened? So I am making sale today. So for that, what is the open market value I need to take? Open market value also today only, same date. Whereas like, kind and quality need not be the same date, it can be any nearest date also can be taken, that is this. And comparable value, open market value should be like transaction value. Transaction value means, so that is only the price involved in the transaction, it should not be value under any rules. Whereas in case of like, kind and quality, either it can be transaction value or value as per rules also. And who is the supplier? Comparable supplier. In case of open market value, same supplier or any other supplier. Whereas in case of like, kind and quality, it should be same supplier. And comparable goods. In case of open market value, it should be same goods. So different goods and all will not be taken. whereas in case of like kind and quality, so minor differences are acceptable. So that's what usually I tell in the class. So you take a washing machine. For a washing machine, so if you take front load washing machine, the open market value should be another front load washing machine only. And in case of like kind and quality, also it should be front load washing machine only, but minor differences means what? So change in the color or change in the capacity, little bit there could be a change, but more or less it should be same. So minor differences are acceptable. That is what like kind and quality is. And in case when money received plus money value of non-monetary consideration is available, we will go by that. But remember, when we have open market value as well as this, we cannot decide here. It's not up to the option of the supplier. So first open market value available means we need to go by open market value only. So what are the 4 priorities? OMV, money received plus money value of non-monetary consideration, like kind and quality, cost plus 10%. What if cost is also not ascertainable? Then 5th point is there, that is residual value, where the value will be determined by the officer. So if the above value is not possible, then the value will be determined as per rule 31. Rule 31 is residual value. So we will follow the principles of valuation and we can determine the value, or alternatively we can go for provisional assessment. We can request the officer to determine the value. So that is this residual value, rule 31. Now, in the second case, what is the second case? Related party transaction including transaction between distinct persons. So we will be taking, so only 4 points. So in the second case, second point is missing. So what is the second point here? Money received plus money value of non-monetary consideration is not there in the case of rule 28. So for remember, for second situation, second point is missing. Okay. So first open market value. If that is not ascertainable, like kind and quality, immediately we will jump to like kind and quality. If like kind and quality also not available, cost plus 10%. If that is also not available, residual value. Related to this open market value, there is one point. What is that? If recipient is eligible for full ITC, whatever is the transaction value in the invoice, that itself will be deemed to be the open market value. For example, I am making sale to a related person. I am raising an invoice for some 100 rupees. That 100 rupees itself will be taken as the value, provided my recipient is eligible for full ITC. When my recipient is eligible for full ITC, if his outward supplies is fully taxable, if his outward supply is partly taxable, partly exempted, he cannot take full ITC. If his outward supply, my recipient's outward supply is fully exempted also, he cannot take ITC. So therefore, recipient is eligible for full ITC means what? His outward supply. Whose outward supply? Recipient outward supply fully taxable. Then only he is eligible for full ITC. Then only whatever price that I declare in the invoice, that itself will be taken as the open market value. What if recipient is not eligible for full ITC? Then we need to determine the open market value. Sir, in question if it is silent, I have not given anything about recipient eligible for full ITC or not eligible for full ITC. You take that recipient is not eligible for full ITC. If recipient is eligible for full ITC, specifically it will be given in the question. If the question is silent, which means that recipient is not eligible for full ITC, and we need to determine the open market value. That is this point. Now, alternatively means instead of following this OMV, like kind and quality, cost plus 10%, alternatively we have another option also for the supplier, and the supplier can choose between either OMV, LKQ, cost plus 10% or this option. What is this option? 90% of the resale price option. Means I am selling to you, you are my related person, I am selling to you. You in turn sell it to an unrelated person. So that sale to an unrelated person into 90% will be taken as my value. For example, I am selling to you for 10,000 rupees and that will not be taken. Why that will not be taken? Because that may not be the true value, because you are a related person and you are not eligible for full ITC. So this 10,000 irrelevant. Now you are subsequently selling to an unrelated buyer. What is the price at which you are subsequently selling? Say 20,000 rupees. That 20,000, assumption here is 10% is the profit margin that you will make. So 20,000 into 90%. What is 20,000 into 90%? 18,000 will be taken as my value. So that should be taken here. So this is alternative only, which means either I can go for OMV, LKQ or cost plus 10%, or I can follow 90%. For example, open market value is only 15,000 and 90% of resale price is 18,000. So now what I can choose? I can choose 15,000, whichever is lower option only that I will be choosing. But remember, this 90% of the resale price option is available only in case of goods, not in case of services. Rule 27 is common for both goods and services. Rule 28 also common for both goods and services. But this 90% of the resale price option is only applicable in case of goods. And one more condition for this 90% of resale price is that recipient should not process that. For example, I am selling to you, you are my related person or you are my distinct person. You should be selling it as such. You should not do any processing. If you do any processing, this 90% resale price option will not be applicable. So recipient should not process those goods but should have been sold it as such. Then there is one more proviso that has been added. This is an amendment, so which is applicable for May 24 exam onwards. What is that? It is about in case of corporate guarantee, which is given by one company to the another company for the purpose of borrowal. So here usually what happens whenever we make some borrowals, unsecured loans and all, so banks expect someone to give guarantee. Secured loan means there is a proper security available, but when it is unsecured loan there is no security, so the bank will expect us to get some guarantee. This guarantee can be given by any person who is having some good financial standing, and this guarantee can be given by individuals also, or this guarantee can be given by corporates also. Okay, now there is a company which is borrowing some money. So now when it is borrowing some money, another company, usually who will give guarantee? Holding company will give guarantee to the subsidiary company. Suppose if the subsidiary company is so sound, then the subsidiary company sometimes will give guarantee to the holding company, but that is minor case only. But usually holding companies will give the guarantee when the loans are being taken by the subsidiary company. Now holding company and subsidiary company are treated as related parties. Usually in case of this guarantee, there is a concept called as guarantee commission. So if I am guaranteeing a loan taken by you, so I expect a commission from you because I am giving you the guarantee for the loan that you are taking. So therefore a commission will be expected. So here holding company, when it gives the guarantee to the subsidiary company, so the subsidiary company will pay a guarantee commission to the holding company. So now in that case, it's a related party transaction. Sometimes the guarantee commission may not be paid also. Consideration may be there or consideration may not be there. But here the logic is, it is coming under 7(1)(c). Why it will come under 7(1)(c)? Holding company and subsidiary company are treated as related parties. Any transaction between related parties is treated as supply under section 7(1)(c). So in this case, what should be taken as the value? The value should be taken as the open market value logically, correct or not? So because it's a related party transaction, rule 28 should be applied. But in case of corporate guarantee between related persons, they have added one proviso. What does it say? Supplier of services providing corporate guarantee to any banking company or financial institution on behalf of the recipient, that is related party, value of supply will be 1% of the guaranteed amount or the actual consideration, whichever is higher. According to me, it is one stupid provision, because holding company is giving guarantee to the subsidiary company for 100 crores. Now in the case of this 100 crores guarantee, the commission, guarantee commission, which is paid by the subsidiary company to the holding company, could be somewhere like 10 lakhs. 10 lakhs could be the actual guarantee commission. Now when 10 lakhs is the actual guarantee commission, but GST will be payable not on 10 lakhs. Okay, see this, there is a holding company and this holding company is giving a guarantee to the subsidiary company for the loans being taken. Okay, guarantee with respect to loans, for which subsidiary company will definitely pay a guarantee commission. So what is that guarantee commission? Let's take the guarantee commission as 10 lakhs. Guarantee commission, that guarantee commission, let it be 10 lakhs. 10 lakhs is taken as guarantee commission. And what is the loan amount? The loan amount is 100 crores. The loan amount is 100 crores. Now, is it supply or not a supply? Definitely it is supply under section 7(1)(c). Why it is supply? Actually 7(1)(a) itself will come, because there is a consideration. As there is a consideration, it will come under 7(1)(a). It's a supply. But we need to determine the value as per rule 28, because they both are related parties now. So due to that reason, value under rule 28. Here this holding company and subsidiary company are treated as related parties. So value under rule 28 is simple. 1% of guaranteed amount. What is a guaranteed amount? 100 crores. 1% of 100 crores or actual consideration. Actual consideration is 10 lakhs. Whichever is higher or whichever is lower, whichever is higher, means even though the actual consideration is only 10 lakhs, so therefore the value will be taken as 1 crore, correct? 100 crores into 1%, so that will be taken as 1 crore will be taken as a value, and on which GST is payable. Now, what if there is no guarantee commission? What if there is no guarantee commission? There is no guarantee commission. Even in that case, the answer will be same. So in case when the guarantee commission is not there also, still the value will be taken as value under rule 28 will be 1% of 100 crores or actual consideration. There is no actual consideration. So whichever is higher is what? Definitely 1 crore in 1 crore. 1 crore will be taken as the value of supply, which means just because a guarantee is being given, unnecessarily the holding company is required to pay GST on this 1 crore, and whatever GST that they pay, and definitely they can recover it from the subsidiary company, and the subsidiary company can take ITC with respect to this. But the twist here is, what if the subsidiary company is engaged in exempted supplies? The entire GST is lost for them now. So that is the stupidity in this provision. But we need to do. But remember, this provision is applicable only in case of corporate guarantee, not in case of personal guarantee. Personal guarantee means what? So wherein a director will be giving guarantee with respect to loans taken by the company. Okay. So director giving guarantee is called as personal guarantee. So that personal guarantee point we are not discussing. Right now we are discussing only about the corporate guarantee. Okay. Now, so there are multiple combinations in corporate guarantee that could be possible. So let's try to understand the corporate guarantee situations. So what are the various situations that will be possible in case of corporate guarantee? Corporate guarantee, so given by, unrelated company to company, between unrelated companies or between related companies, possible. So even unrelated company also can give corporate guarantee. Yes. Given by one related company to another related company, one related company to another related company. So when the corporate guarantee is given by one related company to another related company, so is it supply or not a supply? Yes, it will be supply. It will be supply under section. Now we need to see whether it is for consideration or without consideration. So for a consideration. For a consideration. So then it will become supply under section 71A. And suppose if it is corporate guarantee given by one related company to another related company, without consideration, another related company without any consideration, So in this case, it will become supply under section 71C. Supply under section 71C. In both these cases, what should be taken as the value? In both these cases, the value will be common. So value under rule 28. Value under rule 28 is what? 1% of guaranteed amount or actual consideration, whichever is higher. Actual consideration involved, whichever is higher. Suppose if it is by related company to another related company without any consideration, value under rule 28. What will be taken as value under rule 28? Only 1 point. 1% of guaranteed amount. 1% of guaranteed amount. Suppose if an unrelated company is giving the guarantee, then what will happen? Can unrelated company give guarantee? Yes. They are basically associate companies. So not holding subsidiary company. Holding and subsidiary only will be treated as related under GST, but associated companies are not treated as related. So for example, one company has invested 26% in the other company. As per income tax, they are treated as associated companies, but under GST, they are not treated as related persons. So due to that reason, but sir, there is one point related to 25% in related parties. What is that 25%? There are two companies having a common shareholder, and that common shareholder has invested 25% or more. Then these two companies will be treated as related. But here I am not talking about that. I am talking about one company investing 25% in the other company. So they are associated, or 26% in the other company, they are associated. But they are unrelated for the purpose of GST. Now what will happen in that case? So third point, corporate guarantee given by unrelated company for a consideration. Is it supply or not a supply? Definitely it will become supply under section 71A, because there is a consideration that is involved. Then what will be taken as the value? So definitely rule 28 will not be applicable. Why rule 28 will not be applicable? Because they are not related. As they are not related, we need to take the value under section 15. What is the value under section 15? That is transaction value, which is nothing but the actual consideration that will be taken in this case. And then another point, so number 4, what if it is given by unrelated company without consideration? Is it supply or not a supply? It is not a supply. Why it is not a supply? Because it is unrelated and there is no consideration. So in order to become supply under 71C, 4 points will come. DRIP, DRIP. D for disposal of business asset on which ITC is availed. That is not applicable here. Related party transaction, including transaction between distinct persons. That is also not applicable here. And then we have import of service from a related person, not applicable. Principal agent transaction, that is also not applicable. Consequently, it is not a supply. When it is not a supply, we don't have to determine the value for payment of GST. So this is in case of corporate guarantee. Now, one more point is also possible, that is guarantee given by government. So what if the guarantee is given by government to a company, whether it may be with consideration or without consideration? Then what is the impact of that? So this point also we will write, that is guarantee given by government to whom they will be giving public sector undertakings. They will not be giving it to normal companies, they will be giving it to PSUs. What about this? Is it supply or not a supply? And it may be for a consideration. Definitely it is for a consideration, called as guarantee commission. For a consideration. Is it supply or not a supply? Definitely it will become supply under section 71A. But should we determine the value here? No. Why? Because it is called as exempted supply. Why it is exempted supply? We have seen some activities of government to business entities. In that list of 14 activities, there are 14 specific exemptions with respect to services provided by government to business entities. In that 14 exemptions, one of the exemption is guarantee commission earned by the government. So government will give the guarantee with respect to loans taken by PSUs, for which the PSUs will pay a guarantee commission. That guarantee commission which is received by the government will be exempted. So we don't have to bother about any valuation here, because the activity itself is an exempted supply. Then what if it is a personal guarantee? What if it is a personal guarantee? So who will be giving the personal guarantee, and what is the treatment related to that? So personal guarantee can be given by director or a ex-director. So director giving guarantee to the company, so that we are taking. So continuing to this, so the sixth situation is director giving guarantee to company. Director giving guarantee to company. Is it for consideration or without consideration? Definitely it should be without consideration. Why it should be without consideration? Because there is a RBI circular which says that whenever a director gives the guarantee to the company with respect to loans taken by the company, so the company should not pay any consideration as per RBI circular. So due to that reason, director giving guarantee to company, so will be without consideration. Without consideration. Why it should be without consideration? So as per RBI circular, consideration should not be paid. Consideration should not be paid. So due to that reason, consideration will not be there. Will this become supply or not a supply? It will become supply under section 71C. Why, sir, it will become supply under 71C? Because this circular says that director and company are deemed to be related. They are treated as related. Under which point they are treated as related? Such persons or officers or directors of one another's business. Under that point, so director of a company and the company will be treated as related. So director and company are treated as related. And moreover, it is without consideration, so it will become supply under 71C. And we need to determine, as they are related, we need to determine the value under rule 28. What will be taken as value under rule 28? Whether this 1% of the guaranteed amount or actual consideration, whichever is higher, is applicable in this case. Not applicable, because that proviso is applicable only in case of corporate guarantee. But what we are discussing is not a corporate guarantee, it is a personal guarantee which is given. So, but value will be determined as per rule 28. What will be the value as per rule 28? Open market value. What is that open market value? Nil, as per CBIC circular. Why as per CBIC circular the value will be taken as nil? Because RBI circular says that there should not be any consideration involved. Means consideration should not be paid by the company to the director. Means open market value, generally there won't be any consideration. So how to determine the value? It cannot be determined. Due to that reason, here the open market value should be taken as nil. This is as per RBI circular. So, and CBIC circular, these two are connected. That's what I have already given here in the note. In case of personal guarantee by director to company without consideration, value shall be considered as nil as per CBIC circular. Why? Why like that they have given? Because as per RBI circular, consideration should not be paid in case of personal guarantee by director to company. So there should not be any consideration for that reason. Sir, but can this circular be overridden? Yes. So we can override this circular. Companies can override this circular, but they will not do this. So because we are not talking about the provisions when the companies breach, so they will, if RBI circular is given, they will follow that. But what if they are not following RBI circular and all? It's not useful for exam, because those kind of questions in exam they will not be asking. Okay, so this point only will be tested in exam. Don't worry about that. Then next, what if ex-director giving guarantee to company? Here whether RBI circular will be applicable? So no, because RBI circular is applicable only in case of director giving guarantee to the company, not a ex-director giving guarantee to the company. Means when ex-director is giving guarantee to the company, will there be consideration involved or not? May or may not be. So therefore, seventh case, ex-director giving guarantee to company for a consideration. Is it supply or not a supply? Definitely it will become supply under section 71A. But rule 28 will not be applicable. Why rule 28 will not be applicable? Because they are not related parties. Ex-director and company are not treated as related. So therefore we need to determine the value under section 15. What will be taken as value under section 15? That is transaction value. That will be actual consideration. Whatever is involved will be taken. Okay. Now, last case, what if there is a ex-director and that ex-director giving guarantee to company, without consideration? Possible? Yes, without consideration. Then what will be the activity? Is it supply or not a supply? As it is without consideration, we need to refer to 71C. And as per 71C, they are not related parties. And even principal agent also will not be applicable. Consequently, it is not a supply. When it is not a supply, we don't have to bother about the valuation. So therefore, these are the 8 different combinations which are possible on this amendment. Now any question can be tested in exam. So you should be clear with respect to the treatment. So it is again a very important area. If you are not getting question on this, return the paper and come. That much important it is. Trust me, it will come. Many times my intuition didn't go wrong. So even every attempt I was telling this. So this attempt, definitely this area will be tested. So these 8 combinations, any combination can be tested. At least worst come scenario as a MCQ they will be testing it. Okay. So that is about this area, and this is an amendment we have seen. So we have seen so far rule 27 and rule 28. Then next, principal agent transactions. And here in this regard, one more point also. So that, sir, what if director is giving guarantee to company? So will it come under RCM? I am telling the value itself is nil. There is no GST at all. When there is no GST at all, why RCM, FCM will be applicable? So when RCM will be applicable, first there should be a value and there should be a GST, then only RCM will be applicable. Moreover, here RCM will not be applicable. Why? Because there is another amendment which is there in RCM, which says that one circular has been given. So whether director who is providing services to the company in his personal capacity, generally director service to company will come under RCM. But what if the director is providing service to the company in his personal capacity? For example, director is having a immobile property, commercial property, which he is giving on rent. So now in that case, will it come under RCM or FCM only? FCM only, it will not come under RCM. Generally, director service to company comes under RCM. If it is director service, if the director is acting in a personal capacity, in his personal capacity, that will never come under RCM, it will be FCM only. And that discussion is not at all applicable here, because here first of all the value will be taken as nil and there is no GST liability. Rule 29 talks about principal agent transactions. In case of principal agent transactions, rule 29 is applicable only in case of goods, not in case of services. Rule 27 is applicable for both goods and services. 28 is applicable for both goods and services, but this 29 is applicable only in case of goods. What should be taken? In the third point is missing. So in the second situation, second point gone. In the third situation, third point is gone. So what should be taken? OMV, if not available, cost plus 10%. But for this OMV, they are asking us to compare with 90% of the resale price. So we need to take open market value or 90% of the resale price at the option of the supplier. Otherwise, then cost plus 10% will be taken. And see these notes. Suppose if any of these is not possible, so rule 31 will be applicable, and rule 30 cost means what we have seen. So in such case, that is when open market value is deemed to be transaction value, when the recipient is eligible for full ITC, any value declared in the invoice will be deemed to be the open market value. Means 1 rupee invoice also can be raised. Yes, 1 rupee invoice also can be raised. In that case, invoice can be generated for any value, even 1 rupee is considered as value. Then in case of services, rule 30 will not be applicable. Why? Because rule 30 talks about cost plus 10%. So cost of providing the services is difficult to ascertain. So therefore, in case of services, we can skip rule 30 and directly go to rule 31, that is residual value. And this is the difference between OMV and LKQ. So here we have completed rule 27, 28, 29, 30 and 31. So these are the 5 rules that are connected in this. Now we are looking into rule 31A. So rule 31A is applicable in case of specified actionable claims. So there is an amendment in this aspect here, that previously all actionable claims other than lottery, betting and gambling was excluded from supply. But now they modified this to all actionable claims other than specified actionable claims are excluded from supply. So what are these specified actionable claims? So you remember this keyword HC block. So what are these specified actionable claims? The specified actionable claims is HC block. What is that H? H refers to horse racing, and C refers to casinos, and B refers to betting, and L refers to lottery, and O refers to online money gaming, not online gaming, online money gaming. and G refers to gambling. Sir, why online gaming will not come under specified actionable claims? Because online gaming is treated as OIDR services. Due to that reason, it will not be coming under specified actionable claims. So that's treated as service. And these specified actionable claims are treated as goods. All these specified actionable claims are treated as goods. What is the difference between online gaming and online money gaming? Online money gaming means, so generally we deposit some money and with the objective of winning the money, we play the game. That is known as online money gaming. Online gaming means normally we spend money to play the game, but there the objective is not winning the money. So that is not the objective, just playing the game, but we spend the money to play the game. So that is known as online gaming. Like for example, so there's a Sniper 3D or PUBG or Free Fire. So a lot of Call of Duty, these are all some games which people will play and they will spend money to play the games. Even GTA also, GTA Vice City, etc. So these are like where we spend money to play the game. That is online gaming. Whereas online money gaming is like betting platforms like Rummy Circle, Online Rummy or Dream 11. So these are all some websites wherein we spend money to play. Lot of games are there, betting games like Ludo also there. Ludo betting game is there. You can put 100 rupees, you can play Ludo, and if you win, you will be getting 400 rupees. So that is called as online money gaming. Betting is involved. So that will come under specified actionable claims, and these are all treated as goods. And what is the rate of GST for this? The rate of GST will be 28% in all these cases. Now, what should be taken as the value in this case? In case of lottery, so there are total 6 specified actionable claims. In that, for lottery, we are discussing the value first. What should be taken as the value? So lottery tickets always assumed to be inclusive of GST. Always assumed to be inclusive of GST. And we need to take face value of the lottery ticket or the price notified by the organizing state, whichever is higher, into 100 by 128 will be value, GST will be 28 by 128, always inclusive only. And we will never calculate in case of lottery on exclusive basis. And face value of the ticket means that price that is printed on the ticket. Price notified by the organizing state means, so sometimes the price may be lesser than the face value of the ticket. So if the demand is less, so they will try to reduce the price of the ticket. If the demand is high, they will increase the price of the ticket, who the organizing state. So therefore, whichever is higher will be taken, into 28 by 128 will be GST, into 100 by 128 will be taken as the value. That is with respect to supply of lottery, and always inclusive basis only. Okay. And here rate of GST. So this 28% is the rate of GST, this 12% is not applicable. GST rate is 28% and always assumed to be inclusive of GST. Always GST computed on inclusive basis. Computed on inclusive basis. Then in case of specified actionable claim related to betting, gambling and horse racing, for three cases. So horse racing, betting and gambling. For these 3 cases, they are telling 100% of the face value of the bet or the amount paid to the totalizer. For example, there is a horse racing, 10 horses are there and people will randomly place bets on different horses, but only one horse will win. Now, all the horses people have placed the bet na, that is called as a total bet value, not the people who place bet on the winning horse, all the horses. So whether you are winning or losing, government will always be winning. So therefore the total bet value will be taken as a value for payment of GST. You understood? Means even on losing horse also people will place a bet. So that amount also GST will be payable. So the total bet value or the total amount collected in the bet. And here, whether it will be computed on inclusive basis or exclusive basis, that depends. This they are not telling, it will be always on inclusive basis. So you go by the question. If the question says inclusive, you take inclusive. If the question says exclusive, you take exclusive. But here we don't have any mandatory provision like it should be computed on inclusive basis. So in case of lottery ticket, what should be taken as a value? Come on. And this valuation is given in Rule 31A, B, C. Rule 31A, Rule 31B and Rule 31C. Previously Rule 31A was only there. Now they have added Rule 31B and Rule 31C. So first, in case of lottery, what should be taken as a value? Face value of the ticket or price notified by the organizing state, whichever is higher. and it should be always computed on a inclusive basis. Number 2, in case of betting, gambling and horse racing, these 3 cases, what should be taken as a value? So 100% of the face value, like 100% of the amount collected. So it is like, so total amount collected by the totalizer or organizer, that should be taken as a value, not the commission, total amount collected. Then next we have rule 31B and 31C. 31B is in case of online money gaming and 31C is in case of casinos. Okay. So in case of online money gaming, sir, what about online gaming? For online gaming also we can apply rule 31B. So, but online gaming will not come under specified actionable claims. Online gaming will come under which category? OIDR services. But online money gaming will come under specified actionable claims. But when it comes to valuation, the valuation will be common for both online gaming as well as online money gaming. And 31C is in case of supply of actionable claims in casinos. First we will see online gaming and online money gaming, what should be taken as the value. The value will be amount paid or payable or deposited with the supplier by way of money or money's worth, including virtual digital asset, by or on behalf of the player. So usually what happens is that when we play the online money gaming, so we will deposit some money to play the game. So either it can be money or it can be virtual digital assets like cryptocurrency. Using cryptocurrency also we can place the bet. So this money deposited will be taken as the value. For example, so you have downloaded one Rummy app or some betting app and you started playing. First you need to deposit money. Say you deposited 10,000 rupees and this 10,000 rupees will be chargeable to GST. 10,000 rupees should be taken as the value. Now when you play the game, say for example 6,000 rupees you have spent for playing the game and you lost 6,000 rupees. Now how much is the money left? 4,000 rupees. Now you realize usually people will not get this habit. So what they will do is that let's spend this also so that the 6,000 we can win, because it will become an addiction. Only a great heart will have the guts to withdraw the money. Okay. So therefore you realize 6,000 rupees you spend, at least 4,000 rupees you want to save. So therefore 4,000 rupees you have withdrawn, which means how much you placed as bet is only 6,000 rupees, but the GST is payable on 10,000 rupees. If you withdraw 4,000, you will not get any GST refund, which means GST is payable on the amount deposited. If any amount is withdrawn out of that, we will not get any reduction in the value. Is it clear or not? Then suppose 10,000 rupees you have deposited. You paid GST on 10,000 rupees. In that 6,000 rupees you have spent for playing the bets and you won some bets and you got more money. Say for example, you deposited 15,000. Now in your account 15,000 is there. You deposited 10. In your account 15,000 is there. That 5,000 rupees is what? Gain. On that gain, are you required to pay any GST? No. Either if you withdraw, no need to pay GST. Even using that 5,000 again you will play the game, then also no need to pay any GST on the winning amount. Okay, only on the amount deposited initially we need to pay. Now see the twist, you are withdrawing that 5,000 rupees, again you are putting that 5,000 rupees to play the game. Now it will be considered as a new deposit, again on the GST will be payable. So without withdrawing, if you use it for playing the game, on that there won't be any GST. The moment it is withdrawn and again deposited, it will account for new deposit and again new GST will be attracted. So see this, value of supply will be, remember, amount deposited. Value of supply is what? Amount deposited. That amount can be in the form of money, or it can be in the form of money's worth, or it can be in the form of virtual digital asset. Anyway it can be. So sometimes what will happen, some betting platforms and all, they will not allow you to deposit the money. So the moment you want to play the game, so they will be giving you some mobile numbers. To that mobile numbers, you need to do GPay. The moment you make GPay to that mobile number, so in your account, they will be giving some tokens or coins. So these tokens or coins or points, etc. So is money's worth. So you did not deposit money, but you got some tokens or points. How it is that it is money's worth? Sometimes without attracting any GST, people will try to play the games or betting using the cryptocurrency like Bitcoins or Ethereum coins or Doge coins or Raven coins, etc. Even those coins also will be considered as money's worth only, and on that GST will be payable. That is this money deposited or amount deposited. Now see this point, any amount returned or refunded by the supplier to the player including amount paid or deposited with the supplier, which is not used by the player, shall not be deducted from the value of supply. So 10,000 rupees we deposited. That's the example I gave you. So 10,000 deposited. For this first point, what is the example I gave you? 10,000 deposited. 10,000 deposited. 6,000 used for playing and 4,000 withdrawn. 4,000 withdrawn. Now GST payable on 6,000 or 10,000? 10,000. So this withdrawn 4,000 rupees withdrawn will not be reduced. So whatever money that is withdrawn which is not used by the player shall not be deductible from the value of supply. Okay. And next, second, any winning amount which is used by the player without withdrawing shall not be considered as the amount paid to or deposited with the supplier. What is that? Say this. 10,000 deposited and used for playing, and 15,000, okay, which in turn is used for playing, So now GST payable on 10,000 rupees. Any winning amount which is used by the player without withdrawing shall not be considered as the amount paid to or deposited with the supplier. Suppose in this case 10,000 deposited and used for playing and 15,000, 5,000 withdrawn and again deposited for playing. Now what will be taken as the value? So GST will be payable on 15,000. So simply remember, whatever is the money that you are depositing, on the deposit there will be GST. Okay. And one friend has given super nice point. So GST on deposits and income tax on withdrawals. Correct? Of course. So when you deposit you need to pay GST. When you withdraw you need to pay income tax because it comes under gains, betting, etc. Correct. Then so, but it's not on the withdrawal literally, it is on whatever gain that you are getting, on that you need to pay. So this is about online money gaming, whereas casino also same point, no change. For casinos also same story, but only difference is what? In casinos you will not directly deposit the money, you will spend money to buy the coins, chips. In casino there will be like something called as chips, like green color, red color, yellow color chips and all will be there. So to buy these chips we will be spending money. So that money spent for purchasing of chips will be treated as the value. And suppose we win the money, we win the chips and we redeem it. At the time whether we get any reduction in the value? No. So same story, everything same. Only difference is what? In online money gaming we deposit and here we spend money to buy the chips. Say this. Value of supply will be amount paid or payable for purchase of token, chips or coins or tickets for use in the casino by or on behalf of the player, and these points are common in this case. So again this is another area which you can definitely expect a question, at least a MCQ on this. So MCQ, at least a 2 marks MCQ they will be testing on this specified actionable claim, what should be taken as the value. Then rule 32 we are moving on. So this rule 32 is applicable in case of 5 specified transactions. Rule 32 is a optional valuation. Either we can follow the transaction value or we can follow the value as per rule 32. What are the 5 cases where rule 32 is applicable? Number 1, foreign exchange transactions including money changing. Number 2, air travel agent, number 3 life insurance business, and number 4 second hand dealer in goods, and number 5 vouchers, coupons, etc. So these 5 cases only rule 32 will be applicable. Again remember, rule 32 is a optional valuation, which means that either we can follow transaction value or we can follow the value as per rule 32. So value of supply in special situations, either a transaction value or value under this rule at the option of supplier. For each supply with respect to each invoice we can decide. The first one is foreign exchange transactions including money changing, means basically here we will exchange one currency to another currency, and in that again we have two options. Rule 32 itself is an option. In that rule 32 again we have two options. Option 1, rule 32 2a, what does it says? Check whether one of the currency exchange involves Indian rupee and RBI reference rate is available for that currency on that day. Then either bid rate or ask rate and the RBI reference rate into units of currency will be taken as a value. Say for example, there is a quote which is available, rupee per dollar, that is 82 and 85. So this is the quote, and in this case what happens is that we are exchanging $10,000 for Indian rupees. Now RBI reference rate and RBI reference rate for that day is 83.5 per dollar, rupees 83.5 per dollar. What will be taken as the value? Value under rule 32 sub rule 2a. A refers to first option. We need to take, so either bid rate or ask rate, depends. Which rate should be taken? Here bid rate should be taken because we are exchanging $10,000. When we are exchanging $10,000, bank is buying $10,000. So therefore the relevant rate will be bid rate 82. And what is the RBI reference rate? 83.5. So the difference will be 1.5. On that 1.5 into units of currency. How many units of currency? 10,000. So that will be equals to 1.5 into 10,000. 15,000 rupees will be taken as the value. So when one of the currency exchange involves Indian rupee and RBI reference rate is available for that day, we need to take either bid or ask depending upon the transaction and the RBI reference rate. The difference should be taken into units of currency. This will be taken as the value under rule 32 2a. Suppose in the same case, what will be taken as value under rule 32 2b? Another option. Rule 32 2b is like a slab rate model. In this slab rate model, what will happen is that if the gross amount does not exceed 1 lakh, then 1% of the gross amount or 250, whichever is higher, will be taken. If the gross amount exceed 1 lakh but does not exceed 10 lakhs, 1000 rupees plus 0.5% of the gross amount exceeding 1 lakh. If the gross amount exceed 10 lakhs, 5,500 plus 0.1% of the gross amount exceeding 10 lakhs subject to maximum 60,000. You need to remember these percentages, 1%, 0.5% and 0.1%. Say for example, if the gross amount exchange is 60,000 rupees, 60,000 rupees into 1%, that is 600 rupees or 250, because 60,000 will come in the first slab. So 60,000 into 1%, 600. 600 or 250, whichever is higher, will be 600. Suppose if the gross amount exchange is 20,000, still it is in the first slab. 20,000 into 1%, 200, 200 or 250, whichever is higher, will be taken as 250. Suppose if the gross amount exchange is exactly 1 lakh, 1 lakh into 1% will be 1000, 1000 or 250, whichever is higher, will be 1000. So when you are moving into the second slab, the minimum amount will be 1000. Say for example 3 lakhs. 3 lakhs means you are coming into the second slab. For the first 1 lakh it will be 1000 and remaining 2 lakhs. 2 lakhs into 0.5% will be 1000. So 1000 plus 1000, 2000 rupees will be taken as a value. What if it is 9 lakhs? So again second slab. First 1 lakh 1000, remaining 8 lakhs. 8 lakhs into 0.5%. So that will be 4000. 4000 plus 1000 will be 5000. What if it is exactly 10 lakhs? Still second slab. First 1 lakh it will be 1000, remaining 9 lakhs. 9 lakhs into 0.5% will be 4500. 4500 plus 1000 will be 5500. So the moment you are moving into the third slab, it will be 5500 rupees plus. So there will be extra amount into 0.1%. Say for example, if it is 80 lakhs. 80 lakhs means you are in the third slab. First 10 lakhs it will be 5,500, remaining 70 lakhs, 70 lakhs into 0.1%. So 70 lakhs into 0.1% will be 7,000. 7,000 plus 5,500. So that will be 7,000 plus 5,500 is what, 12,500 will be taken as the value. Now, what if it is like 800 lakhs? 800 lakhs, first 10 lakhs will be 5,500, remaining 790 lakhs into 0.1, 79,000, but the maximum amount is only 60,000, that will be taken as the value. Now, applying this, here in this case, what is the gross amount? Suppose if you are determining the value under rule 32, sub rule 2b, what will be taken as a value? Take the gross amount exchanged in Indian rupees. What is the gross amount exchanged in Indian rupees? $10,000 into 82 rupees. So, gross amount in Indian rupees, gross amount is $10,000 into 82 rupees per dollar, that will be how much? 8 lakh? 8 lakh 20,000. 8 lakh 20,000 means that comes under which slab? Second slab. For the second slab, what should be taken? First 1,000, minimum 1,000 rupees plus what is the extra amount? 7 lakh 20,000. 7 lakh 20,000 into 0.5%. So please do this. 7 lakh 20 into 0.5% plus 1,000. 4,600 will be taken as a value. So this is how we need to arrive at the answer. Then second, what if RBI reference rate is not available? If in above case, RBI reference rate not available. So then what we will do? Simple, we will be taking gross amount exchanged in Indian rupees into 1%. Say this. One of the currency exchange involves Indian rupee and RBI reference rate not available for that currency on that day. So gross amount in Indian rupees into 1%. So this is in case of rule 32(2)(a). So the value under rule 32(2)(a), value under rule 32(2)(a) is gross amount into 1%. What is the gross amount? 8,20,000. 8,20,000 into 1%, that will be 8,200 will be taken as value. Whereas what will be taken as value under rule 32(2)(b), no change. So whether RBI reference rate available or not available, this will be always same. 1,000 rupees plus 7,20,000 into 0.5%, that will be coming to 4,600. Then next we will be taking number 3. What if both the currencies exchange involves in foreign currency? So when both the currencies exchange involves foreign currency, convert both the currencies into Indian rupees using RBI reference rate into 1%, whichever is lower will be taken. Say for example, we have dollar per pound, so is 1.5 and 1.8. We are exchanging, so 6,000 pounds for dollars. Okay, RBI reference rate for rupee per dollar is 85 and rupee per pound is 140. Then what will be taken as the value in this case as per 32(2)(a), value under rule 32. Value under rule 32(2)(a) will be gross amount exchanged in Indian rupees using RBI reference rate into 1%. So lower of what? So take the sold currency, that is 6,000 pounds. 6,000 pounds into RBI reference rate, that is 140 per pound into 1%. So 6,000 into 140 into 1%. How much that will come to? 8,400. Now 6,000 pounds, 1.5 rupees means how many dollars? So dollars wise, if you see 6,000 pounds, if you take 1.5, you will be getting $7,500. Now that $7,500 into exchange rate 85 rupees per dollar into 1%. So how much that comes to? 9,000. 6,000 into 1.5, 9,000. 9,000 into 85 into 1%. 7,650, whichever is lower, therefore 7,650 will be taken as the value. So therefore the purchased currency as well as sold currency, convert both the currencies into rupees using RBI reference rate into 1%, whichever is lower will be taken as the value in this case. And in this case, whether 32(2)(b) is possible? No. Value under rule 32(2)(b) not possible. Why 32(2)(b) not possible? Because both the currencies are exchanged which are foreign currencies, so we cannot determine the value in case of rule 32(2)(b). So this is about 32(2)(a) and 32(2)(b). Now in these two options, which option I should choose? I can choose any option, but that option chosen in the beginning of the financial year will be applicable throughout the financial year. But sir, you said invoice wise we can choose. Yes, invoice wise we can choose transaction value and value under rule 32. But the moment you go into rule 32, in rule 32 we have two options that we need to decide in the beginning of the financial year that will be applicable throughout the financial year. Option to be decided in the beginning of the financial year which shall be applicable throughout the financial year, and what will be taken as a transaction value? Currency conversion fee or currency markup fee. So whatever is the actual consideration that the bank or forex dealer is collecting from us for doing the currency exchange, so that markup fee or currency conversion fee will be taken as a transaction value. We can go by transaction value also. Wherever rule 32 is not possible, we can determine the transaction value. This is about 32 sub rule 2. Then 32 sub rule 3 is in case of air travel agent services. In case of air travel agent services, so air travel agent is required to pay GST on 5% of the base fare in case of domestic bookings and 10% of base fare in case of international bookings. Base fare will be the basic amount that will be there in the ticket. In air ticket there are three components: base fare, fuel surcharge, other charges and taxes. In that the base fare is the first component. On that first component into 5% in case of domestic bookings, 10% in case of international bookings. Then life insurance business. In life insurance business, so if it is a risk cover policy means term insurance wherein we will pay the premium. If nothing happens, we will not get anything backwards. So that is called as term insurance. In case of term insurance, entire premium will be income to the insurance company. So therefore on entire premium GST will be payable by the insurance company. Whereas in case of reinvestment policy, in reinvestment policy whatever premium that we pay will not go into the hands of the insurance company. In that they will deposit a percentage in the stock market or some debt instruments, etc. So the remaining amount will be taken as value on which they will pay GST. So premium collected minus amount allocated for investment, but condition, important condition is that the amount allocated for investment should be communicated to the policy holder at the time of collection of the premium. So where the amount allocated for investment is intimated to the policy holder, gross premium minus amount allocated for investment. Then single premium annuity policy, there is only one premium that is involved. Rather than paying every year, a single premium will be paid. So in that case 10% of that single premium will be taken as the value. So risk cover policy, entire premium collected. Single premium annuity policy, 10% of the single premium. Reinvestment policy, amount collected, premium collected minus amount allocated for investment. If amount allocated for investment is not communicated to policyholders, then what it will be? It will be like a normal life insurance policies. In case of normal life insurance policies, so what should be taken as a value? 25% of premium in first year and 12.5% of premium of subsequent years. So every year insurance company will have first year premium and subsequent year premium. So this year whatever new policies that they have given, premium collected is first year premium. Those who already took the policies in the previous years, they will pay premium this year, that is known as subsequent year premium. So first year premium into 25%, subsequent year premium into 12.5%, that will be taken as a value in this case. Then next one, rule 32 sub rule 5, buying and selling of second hand goods. In case there is a person, a dealer who is engaged in purchase of second hand goods and sale of second hand goods, so then only this will be applicable. My purchase also used goods, my sale also used goods. Then I need to take the margin scheme. What is margin scheme? Sale price minus purchase price will be taken as the margin scheme, and on the difference only GST will be payable. For example, I am purchasing a used car for 1,50,000. I am selling this used car for 2,50,000. Now what is the margin here? 1 lakh. So I need to pay GST only on 1 lakh. Sale price 2 lakh 50, purchase price 1 lakh 50. So 2 lakh 50 minus 1 lakh 50, on 1 lakh only GST will be payable. So value equals to selling price minus purchase price, that is margin scheme. What if it is negative? For example, I am purchasing a car for 2 lakh 50 and I am selling it for 2 lakhs. So 50,000 rupees is loss for me. Whether I need to pay any GST? No. As the margin is negative, so you don't have to pay any GST, value will not be there. ITC should not be availed on the purchase. So I should not avail any ITC. If the ITC is availed, margin scheme is not possible. Means at the time of purchase of the car, I should not have taken any ITC. So if ITC availed, anyhow I will pay GST effectively on margin only. So due to that reason, this margin scheme is not applicable. Even though I gave you example of car, but this is applicable in case of all second hand goods. And then suppose in case where we do the repossession and sale, we are a finance company. We would have given finance with respect to an asset, motor vehicles or assets, etc. Now the person has not repaid EMIs. When he is not paying the EMIs, as a financier we will do repossession of that asset, and this repossessed asset we will sell. At the time of repossession, whether this asset is a new asset or a used asset, and we are selling that used asset to recover our finance amount. So which means we will also come under the category of second hand dealers. So in this case, what should be taken as the sale price, the price at which that repossessed asset is sold. But what will be taken as a purchase price? We are not buying it, we took it as a repossession, then what should be taken as a value? So we need to give a depreciation. How to calculate the depreciation? 5% for every quarter or part thereof from the date it is purchased, the asset is purchased, till the time it is sold. So repossessed and sold. So we need to count that. So purchase price is original purchase price to the defaulting borrower, who is an unregistered defaulting borrower, minus 5% for every quarter or part thereof from the date of purchase till the date of disposal of that repossessed asset. So that should be taken as a value in this case. Then in case of coupons or vouchers, so the value will be money value of supplies redeemable against such voucher or coupon. So for example, we have got a voucher. That voucher, if you redeem, you will be getting goods worth rupees 1000. Then what will be taken as a value of this voucher? 1000 rupees will be taken as a value of this voucher. Money value of supplies redeemable against such voucher, that will be taken. Then there are some notified service between distinct persons without consideration. The value should be taken as nil, but the services are yet to be notified for this purpose, so this rule is not applicable at present, so you don't have to remember this. Then next point is related to TCS. Generally, as per 15(2)(a), all taxes, duties and cess by whatever name called other than GST should be included in the value. Then whether the TCS which is collected by the supplier from the recipient under Income Tax Act should also be included in the value? No, because TCS is not a tax on income. TCS is a tax on expenditure. So it is an interim levy, not having the character of tax. For example, I am a car dealer. I am selling a car to you, and apart from the price of the car, I am also collecting TCS at 1% from you, plus GST also I am collecting. While computing GST, whether this 1% TCS should be included in the value of the car? No, because this is basically your expenditure. On your expenditure, I am collecting this 1%, which is an interim levy, and I will deposit it, so that you have to show the source of income to the income tax department, and you need to pay tax. Suppose if you don't have any income tax, that 1% you will fully get it as a refund. So due to that reason, it is not having the character of tax, it is basically interim levy. So CBIC circular says that this TCS collected by the supplier from the recipient under Income Tax Act should not be included in the value. That is this. Any taxes, duties and cess shall be included in the value, but TCS is not includable in value as it is an interim levy but not having character of tax due to that reason. Then next, usually in case of banking companies, financial institutions, they will be appointing business facilitators and business correspondents. These people are basically like agents. So whichever work the bank has to do, that work will be done by these business facilitators and correspondents. So they will be collecting some service charges. So these service charges they collect and they remit to the bank. So on these service charges, they are not required to pay GST. The GST is payable by the bank. Then what will be included in the value of their supply? It is only the commission. So they get a commission, that will only be their value of supply. See this, there is a banking company and there is a business correspondent or business facilitator, and there is a customer. Now business correspondent or facilitator will provide the service on behalf of bank to the customer, and they will be collecting service charges from the customer, and they will remit that service charges to the banking company. For doing this activity, so they will get a commission. Now what will be taken as value of supply in the hands of BC and BF? It is commission. What will be taken as value of supply in the hands of the banking company? It is the service charges. Then next we have rule 34, which talks about relevant date for determination of exchange rate in case when the transaction is in foreign currency. I mean sale of goods or purchase of goods or supply of services or any import of services. We need to pay GST on that. Now the invoice is in foreign currency. Now for me, I have to pay GST in Indian rupees. So I have to convert the invoice which is in foreign currency into Indian rupees. For that, what exchange rate should be taken? In case of goods, I need to take CBIC notified exchange rate. In case of services, GAAP rate. Usually GAAP rate is average of the buying rate and the selling rate. So that will be taken. So in case of goods, CBIC rate. In case of services, GAAP rate. Prevailing on which date? Prevailing on the time of supply for this transaction. For every transaction there will be a time of supply. You see the time of supply for the transaction. On that date, whatever is the CBIC rate or GAAP rate you take and multiply, you will get the value in Indian rupees. On that you pay the GST. Suppose if I have taken 85 rupees per dollar and I paid the GST on import of goods, and actually so I am paying 86 rupees per dollar. 85 is the CBIC notified rate, but at the time when I made the remittance, it is 86 rupees per dollar. Now on that extra 1 rupee, again should I compute the GST? Not required. So ignore the foreign exchange gain or loss. So exchange gain or loss shall be ignored for the purpose of GST. So these are the various points related to value of supply. We completed this, and there are few queries. So let's see. Sir, what will be the value of a second hand car if ITC is availed? If ITC is availed, the value will be full value, sale value. Don't go for margin scheme. Full sale price will be taken as the value. In rule 32 sub rule 5, quarter means calendar quarter. Everywhere in GST and customs, yesterday itself I told you that we need to take only calendar quarter only. It should not be like, so January 15th to April 15th if you see, actually it is 3 months only. But it should be taken as 2 quarters. Why it should be taken as 2 quarters? Because calendar quarter logic we should apply. So everywhere it will be, wherever quarter comes in GST and customs, it will be calendar quarter only. Okay. Then next, gaming agency is a supplier. So supplier of online money gaming has to pay GST. Yes. So definitely supplier only will be paying GST even if the supplier is located outside India. So that point comes in section 14A, place of supply. There I will discuss with you. So online money gaming supplier is only liable to pay GST. Online money gaming is not covered under RCM. It is covered under FCM. Always supplier only will pay. Sir, what if the supplier is located outside India? Then also that supplier only will be paying GST. Then, sir, the gaming agency is only has to pay GST. Yes, correct. Then what about the bonus given Rummy circle into the user account? See, that bonus is basically not coming here because bonus will be coming under an incremental amount only, like a winning amount only they will be giving. So on winning amount there is no GST now, only on the amount deposited there will be GST. So how much amount you have deposited, that only should be taken into that user account. Yes, fine. Then we will move on to the next area, that is composition scheme. So please take that, page 98, segment 10. Section 10 deals with composition scheme. So in this composition scheme only some minor amendments are there, and composition scheme under section 10 is applicable. So two composition schemes are there, 10.1 and 10.2a. 10.1 composition scheme is applicable for manufacturer, trader and supplier of food service provider, but 10.2a composition scheme is applicable to any person, manufacturer, trader and any service provider. Now 10.1 composition scheme is applicable if my aggregate turnover during previous financial year does not exceed 1.5 crores. Whereas in case of 8 states, it will be taken as 75 lakhs. So what are the 8 special category states for which 75 lakhs will be taken? You can see that MMTN USAM, Manipur, Mizoram, Tripura, Nagaland. MMTN, Manipur, Mizoram, Tripura, Nagaland. U for Uttarakhand. S for Sikkim. A for Arunachal Pradesh, not Assam. And M for Meghalaya. So these are the 8 states for which the limit will be 75 lakhs. For other state, the limit will be 1.5 crores. So I am talking about 10-1 composition scheme. I am a registered person. My aggregate turnover during the previous year does not exceed 1.5 crores or 75 lakhs in the 8 states. Then current year I can opt for composition scheme. Now, what if I am having business in 2 states? One in Tamil Nadu, another in Nagaland. Tamil Nadu, the applicable limit will be 1.5 crores. Nagaland, it will be 75 lakhs because Nagaland will come in the list of that 8 states. Then what should be taken as my effective limit so that if it crosses current year, I cannot go for composition scheme, 75 lakhs. Because in composition scheme, you remember one point, all in, all out. If one registration is ineligible for composition scheme, all other registrations of the person is ineligible for composition scheme. When you see Tamil Nadu registration, Tamil Nadu I can go for composition scheme because aggregate turnover is 1.5 crores. Whereas in Nagaland, I cannot go for composition scheme because aggregate turnover will be only 75 lakhs. As I am unable to go for composition scheme in Nagaland, so consequently I will not be able to go for composition scheme in case of Tamil Nadu also. So therefore, the limit will be taken as 75 lakhs. The lower limit only will be taken. If in few states we are under 150 lakhs and few states it is 75 lakhs, 75 lakhs only should be taken as the limit. Then next point is that to whom it is applicable. So first, when applicable? When applicable, aggregate turnover during previous year does not exceed 1.5 crores or 75 lakhs in case of 8 states. What are those 8 states? MMTN, USAM, Manipur, Mizoram, Tripura, Nagaland, Uttarakhand, Sikkim, Arunachal Pradesh and Meghalaya. And to whom it will be applicable? Manufacturer, trader, supplier of food service provider. Only 3. Manufacturer, trader, supply of food service provider. But we have a relaxation here. What is that relaxation? We can provide services up to 10% of turnover during previous year or 5 lakhs, whichever is higher. That is, I am a manufacturer, I am a trader, I am a supplier of food service provider. I can also provide any other services. Up to what limit? There is a limit. Being a manufacturer, being a trader, being a supplier of food service provider, so I can provide services, but I should ensure that the turnover for these services, being a manufacturer, I have an outer limit of 1.5 crores or 75 lakhs, but I can provide services. To what extent I can provide the services? 10% of turnover during previous year. Say previous year my turnover is 120 lakhs. 120 lakhs into 10% is 12 lakhs. 12 lakhs or 5 lakhs, whichever is higher. So I can provide services only 12 lakhs during the current year. So what services? Any services other than supply of food. Supply of food, there is no restriction. Being a manufacturer, being a trader, being a supplier of food service provider, no restriction. But other services I can provide only 10% of turnover during previous year or 5 lakhs, whichever is higher. Why 5 lakhs is given here? Because previous year, this is the first year I am starting the business. My previous year turnover is 0 and 0 into 10% will become 0. So that's why minimum 5 lakhs services can be provided. And what is the benefit of reduced rates? Now, if I am a manufacturer, the applicable rate for me is 0.5% CGST and 0.5% SGST on what turnover? Taxable turnover or total turnover? Total turnover. Whereas if I am a service provider engaged in supply of food service provider, then what is the rate of GST? 5%, that is 2.5% CGST, 2.5% SGST on what turnover? Again, total turnover. Suppose if I am a trader or provider of services up to 10% limit. In these two cases, I am a trader or limit up to which service is provided is 10% na. The 10% services, the rate will be same. 0.5% CGST, 0.5% SGST on what turnover? Taxable turnover. So 1%, that is 0.5 CGST, 0.5 SGST on taxable turnover in case of trader or service provider up to the limit allowed. This is the benefit of reduced rates. And current year up to what limit I will be into composition scheme? Up to 1.5 crores or 75 lakhs I will be in composition scheme. After crossing that, I will be going into normal scheme. And what is the situation in case of 10(2)(a)? So 10(2)(a) applicable when? If my aggregate turnover during previous year does not exceed 50 lakhs. For 10(2)(a) the limit is 50 lakhs. And to whom 10(2)(a) is applicable? Manufacturer, trader and any service provider. So I can be into anything. So basically if 10(1) is not applicable, then only people will go for 10(2)(a). Because for a manufacturer, 10-1 is only preferable because the limit is 150 lakhs or 75 lakhs, whereas 10-2A it is only 50 lakhs. So for manufacturer, trader and supplier of food service provider, 10-1 is only best. So 10-2A is basically for a service provider other than supplier of food, they will go for 10-2A. In 10-2A, the limit of 10% is not applicable. They can provide any amount of services, but the overall limit, outer limit should be 50 lakhs. What if current year we cross 50 lakhs? Means we will go out of the composition scheme and we will move into normal scheme. And what is the benefit of reduced rates? This is 3% CGST, 3% SGST on total turnover. Okay. So rate wise also for 10-2A it is high than 10-1. And next, is there any difference in the conditions? Yes. So people who are making certain supplies during the current year cannot go for composition scheme in case of 10-1. So that list of conditions is S9 RCM that you can see in the page 100, third page. So S9 RCM. So persons during the current year, all these conditions you should see for the current year. Previous year is not applicable. Current year, the moment you opt for composition scheme, you should not make these supplies. What is that? Yes. This is about 10-1. Yes is with respect to service providers other than supplier of food and beyond 10% limit. So if I am a service provider providing service other than supplier of food or beyond 10% limit, I cannot continue in composition scheme 10-1 na. So that is a restriction. Then N for non-resident taxable person. So already we know non-resident taxable person. I asked you to remember cricketers who are coming from outside India to India, not having any fixed place of business. So they are NRTP. Then I, interstate supplier of goods or services. So if I am under composition scheme, I should not make interstate supply of goods or services. If I make, I am disqualified from the composition scheme. And N, non-taxable supplies. So what are non-taxable supplies? Alcoholic liquor for human consumption and petroleum products. If I make those supplies, I am disqualified from the composition scheme. Then another point is E, supplier of services through e-commerce operator, that is the amendment. Previously, if you are supplying goods or services through e-commerce operator, you cannot go for composition scheme. But now they have amended this. Only supplier of services through e-commerce operator cannot go for composition scheme. Sir, supplier of goods through e-commerce operator can go for composition scheme? Yes. For example, I am a trader. I am selling goods through e-commerce operator. Can I go for composition scheme? Yes. But remember, the other condition should be satisfied. What is that? You should not make interstate supplies. Means you can make only intrastate supplies. See, through e-commerce operator you make supplies, but ensure that you are not making inter, because through e-commerce operator if you make inter, the other condition is breach, because of which you will be disqualified from the composition scheme. Means you should make only supplies within the state. So that's the reason why many times in Meesho, etc. and all, when you enter the pin code, they will tell this product cannot be shipped to your location, because that supplier might be under composition scheme. So he can make supplies through e-commerce operator, but they should not make interstate supplies. That is a restriction. So services, no, services not possible. For example, restaurant which is supplying food through Swiggy, Zomato, etc. Can they go for composition scheme? No. Being a restaurant, they can go for composition scheme. But the moment they make services through e-commerce operator, it is not possible. Then R for RCM under 9 subsection 4. You remember this easily. Yes, 9 RCM. So section 9 is RCM. Usually section 9 is RCM. So yes, 9 RCM. Yes for services other than supply of food or beyond 10% limit. 9. N for non-resident taxable person. I for interstate supply of goods or services. Another N, non-taxable supplies. E, supply of services through e-commerce operator. R, RCM. In that RCM, 9 subsection 4 RCM. To whom 9 subsection 4 RCM is applicable? To a promoter or builder who is having some inward supply from a unregistered person. So they need to pay GST under RCM. If they have not paid any GST under RCM 9.4, then they cannot go for composition scheme. Even otherwise they cannot go for composition scheme, because promoter or builder, by selling one flat itself, they will be making a huge amount. So therefore this point is practically irrelevant. Then C for casual taxable person. Who is a casual taxable person? A person who is coming from other state to this state, who is not having any fixed place of business in this state, is called as a casual taxable person. So basically actors who come from other state to act in this movies, so of this state will be coming under CTP. So like NRTP outside India to India, CTP is from other state to this state, and both case they don't have any fixed place of business in this state. And casual taxable person also cannot go for composition scheme. Then M for manufacture of certain notified goods. What are those notified goods? Ice cream, edible ice, pan masala, tobacco and tobacco products, aerated waters, bricks and roofing tiles. So these are the only goods. So what are those notified goods? First, related to ice cream, edible ice. Then tobacco products, pan masala, tobacco products. Then aerated waters, beverage industry. Then bricks and roofing tiles. Manufacturer of these goods only cannot go for composition scheme, but a trader of these goods can go for composition scheme. Yes. So this is about S9 RCM. Whereas in case of 10-2A also this S9 RCM is applicable, but in that S point we don't have. Why we don't have? Because any service provider can go for 10-2A na. So difference in conditions, if you see, here it is S9 RCM, here it is only 9 RCM. Then next one, what is the meaning of aggregate turnover for determining the eligibility for composition scheme? So both cases, these are the only differences between 10-1 and 10-2A, and all other points will be common between 10-1 and 10-2A. So apart from this page, the next page information and all, so will be common. So therefore, first aggregate turnover, in both places we come across aggregate turnover. Here aggregate turnover during previous year should not exceed 1.5 crores, and here aggregate turnover during previous year should not exceed 50 lakhs. So what is that aggregate turnover? Generally the meaning of aggregate turnover is, it will include taxable supplies, exempted supplies, non-taxable supplies, zero rated supplies. Usually aggregate turnover will be computed on a all India basis, and aggregate turnover excludes only two things, that is inward supplies covered under RCM, and then taxes, GST, CGST, SGST, UTGST, IGST and compensation cess. This is the general meaning of aggregate turnover for determining the registration, etc. Now, what is the difference between that aggregate turnover definition and aggregate turnover for the purpose of composition scheme? Ditto, same, but except for two differences. Difference number one, interest on loans, advances, deposits, generally part of aggregate turnover, but for composition scheme, interest on loans, advances, deposits should be excluded. And then pre-registration turnover will not be taken generally, that aggregate turnover for composition scheme, pre-registration turnover will be included. So these are the two adjustments you need to remember. So aggregate turnover will be computed on the basis of turnover on an all India basis, and will include the value of all taxable supplies, exempt supplies and exports made by all persons with the same permanent account number, but would exclude inward supplies under reverse charge as well as GST. And interest income will not be considered for calculating aggregate turnover as well as turnover in a state or union territory. Now you can see in the last page I have given the turnovers, various turnovers that we come across. So that I have given in page number 244. You can see that page number 244. So I have given meaning of various turnovers under GST. So there you see what and all. First we have aggregate turnover for determining eligibility for registration. So what will come in this turnover? Taxable supplies will come, exempted supplies will come, non-taxable supplies will come. But inward supplies under RCM, basically turnover means outward supply. So inward supplies under RCM will not come in turnover even though you are paying GST. Then GST, all GSTs you should exclude, it should not come in turnover. Then old indirect taxes, whether old indirect taxes will come in turnover? Yes, only in one place I told you it will not come. Where? For ITC purpose. For ITC purpose, rule 42, rule 43 and section 20, old indirect taxes will not come. But that also I have given here. Say this. So turnover for computing reversal of ITC and distribution of ITC by input service distributor, this old indirect taxes will not come in the turnover. Okay, I gave the comparison over there. Then next, interest on loans, advances, deposits, generally in aggregate turnover it will come. Whereas interest on account of delay in receipt of consideration also it will come. And this aggregate turnover for determining eligibility for registration, whether we do it on all India basis or state wise, we do it on all India basis. And whether we will check it for the current year or the previous year, current year for registration. First we are discussing the general meaning of aggregate turnover. For registration purpose, we will check it for the current year. And whether interstate supplies also will be included in this, yes. Whether pre-registration turnover will come, that is not applicable, because we are determining this aggregate turnover only for the purpose of registration. See, this is the general meaning of aggregate turnover. So what and all you should remember? Taxable supplies, exempted supplies, non-taxable supplies, zero rated supplies, and inward supply under RCM will not come, GST will not come. And so this is the basic meaning of aggregate turnover. Now, from this aggregate turnover for determining the eligibility for registration to aggregate turnover for determining eligibility for composition scheme, you see what are the differences. So this aggregate turnover for composition scheme, we see for the current year or for the previous year? We see it for the previous year. So that's what we studied. If my aggregate turnover during previous year does not exceed 1.5 crores or 75 lakhs, for the current year I can opt for composition scheme. So therefore I need to check this aggregate turnover for previous year. Whereas usually aggregate turnover will be computed for current year, but for composition scheme purpose we check it for the previous year. That's the difference. Then another difference you see, generally aggregate turnover includes interest on loans, advances and deposits, but for composition scheme aggregate turnover do not include interest on loans, advances, deposits. Then pre-registration turnover should be included in the aggregate turnover for composition scheme. Apart from this, is there anything that is changed? No, everything will be same. Okay. Now you may get a doubt, sir, if you are making non-taxable supplies, you said we cannot go for composition scheme, but we are including in composition scheme aggregate turnover, so non-taxable supplies. That's what I said. So previous year you can have non-taxable supplies, previous year you can have interstate supplies, previous year you can have anything, but current year the moment you go for composition scheme, you should not have any of those S9 RCM. If you have any of those S9 RCM, you are disqualified from the composition scheme. So now, what are the extra points you need to remember from regular meaning of aggregate turnover to aggregate turnover for determining the eligibility for composition scheme? So first, aggregate turnover will be taken for previous year. Then number 2, interest on loans, advances, deposits will not be included, and pre-registration turnover should be included. Remaining points are same. Then next we have turnover for determining 10% limit. What is the difference between aggregate turnover and turnover for determining 10% limit? What is the change? You see this, generally aggregate turnover will be computed on all India basis, but turnover will be computed state wise. It will not be on all India basis, it will be state wise. Then another point is that, so here aggregate turnover, whatever we have seen, everything is same, only this difference, correct? Only this difference. So what is the difference between aggregate turnover and turnover for computing 10% limit? What is the purpose of aggregate turnover? To check whether I am eligible for composition scheme during the current year. What is the purpose of this turnover for 10% limit? Because during the current year I can provide services up to 10% of turnover during previous year or 5 lakhs, whichever is higher. For that purpose we need to know what is the difference between these two. Both are same. Aggregate turnover definition as well as turnover definition, both are same. Only difference is that aggregate turnover will be computed on all India basis, turnover will be computed state wise. How it is going to impact? So it so happens that during the previous year, so we are doing business in 3 states, Tamil Nadu, Karnataka and Kerala, and turnover if you see 60 lakhs, 30 lakhs, 60 lakhs, 30 lakhs and 40 lakhs. So this is the turnover during previous year. So the total turnover if you see 130 lakhs is the total turnover during the previous year. Now during the current year What is the limit up to which services can be provided? Current year limit for services. Current year limit for services under section 10.1. We are under composition scheme 10.1. So what is the limit up to which services can be provided under 10.1? You take the previous year, so 130 lakhs. 130 lakhs into 10% is what? 13 lakhs or 5 lakhs. Whichever is higher will be 13 lakhs. That is the correct answer. Correct? Wrong answer. So because the 10% should be computed state wise, it should not be taken on all India basis. So 10% of turnover during previous year, it's not 10% of aggregate turnover, 10% of turnover during previous year. So that is 60 lakhs into 10% or 5 lakhs, whichever is higher. So whichever is higher is what? 6 lakhs. That is the service up to which we can provide in Tamil Nadu. Whereas in Karnataka, 30 lakhs into 10%, 3 lakhs or 5 lakhs, whichever is higher. So what is the limit up to which services can be provided? 5 lakhs, not 3 lakhs. Then 40 lakhs into 10%. 40 lakhs into 10% is 4 lakhs or 5 lakhs, whichever is higher. So what is the limit up to which services can be provided? 5 lakhs. Then what is the overall limit up to which services can be provided? 16 lakhs is the limit up to which service can be provided, and this 16 lakhs is divided like 6 lakhs in Tamil Nadu, 5 lakhs in Karnataka and 5 lakhs in Kerala. If you cross 6 lakhs in Tamil Nadu or 5 lakhs in Karnataka or 5 lakhs in Kerala, you are disqualified from the composition scheme in one state. Consequently, you are disqualified from composition scheme in all other states as well. So mainly turnover is state wise. That's how this will be tested. Then next one. So in composition scheme, we come across 3 turnovers. One is aggregate turnover for determining the eligibility, whether you can go for composition scheme or not. Number 2 is turnover for computing 10% limit. The third turnover is turnover for payment of GST under composition scheme. What should be taken in that case? So turnover for payment of GST under composition scheme, whether we pay GST based on current year turnover or previous year turnover? Current year turnover. So we should not see previous year turnover, we should take the current year turnover. The moment you see turnover, turnover will always be state wise, and then pre-registration turnover will be included or excluded. Pre-registration turnover will be excluded. Also, you should not have interstate supplies, because if you have interstate supplies during the current year, you are disqualified from the composition scheme. And even non-taxable supplies you should not have. If you have non-taxable supplies also, you are disqualified from the composition scheme. So that is the difference, and remaining points and all will be same. No change in that, and only difference is what? From regular turnover for 10% limit to turnover for payment of GST under composition scheme. Turnover for computing 10% limit, we take the previous year turnover, but turnover for payment of GST under composition scheme, we need to take the current year turnover. And this S9 RCM should not be there in the current year, means non-taxable supplies, interstate supplies and all should not be there in the current year. And pre-registration turnover, that's the main point. Pre-registration turnover will be included generally for aggregate turnover as well as turnover for computing 10% limit. But for computing tax payable, so this pre-registration turnover will not be included. How that will be connected? Say this. So this is like we have got during the current year. So during the previous year, our turnover is 0 because we have not commenced the business. During the current year only we commence the business. Current year only we commence the business. Okay. And after commencing the business, we crossed a threshold limit of 40 lakhs. We crossed a threshold limit of 40 lakhs. This is the threshold limit for registration. And thereafter, our turnover is somewhere like 180 lakhs. 180 lakhs is our aggregate turnover during current year. aggregate turnover or turnover during current year is 180 lakhs. Now, this person is a trader. This person is a trader. And what is the GST that will be payable? Now, what is the overall aggregate turnover or turnover, aggregate turnover or turnover? How much? 180 lakhs. In this 180 lakhs, what is the turnover under composition scheme and normal scheme? Composition scheme is 150 lakhs and normal scheme is 30 lakhs. Now, in this composition scheme, pre-registration turnover you need to exclude. Pre-registration turnover. What is the pre-registration turnover? 40 lakhs. That we need to exclude. Take out the pre-registration turnover. So, what is the balance turnover? 110 lakhs. Okay. So, on this 110 lakhs, you need to pay GST at 1%. Correct. That is 0.5 CGST, 0.5 SGST. Whereas, on this 30 lakhs, we need to pay GST at what rate? Normal rates. Whatever is the normal rates that is applicable, that should be taken. So, this is the meaning of pre-registration turnover will be excluded. So, first overall turnover you take, divide into two. What is the turnover under composition scheme? What is the turnover under normal scheme? Whatever is the turnover under composition scheme, you reduce the pre-registration turnover. So, remaining turnover will be coming under composition scheme. So, that is the meaning of this statement. So, these are the three turnovers that we come across in composition scheme. One is aggregate turnover for determining the eligibility to opt for composition scheme. Second is turnover for computing 10% limit, and third is turnover for payment of GST under composition scheme. Now, so coming back to the discussion where we started. So, this appendix turnover will help you because in many places it will be useful. Then, so what is the meaning of aggregate turnover? You understood. Then next point, person opting for composition scheme can provide service up to 10% of turnover. This point also we have seen, and 10% of turnover during previous year or 5 lakhs, whichever is higher. And while determining this, interest on loans, advances, deposits will not be taken. Yes, we have seen even for aggregate turnover, 3 turnovers, interest on loans, advances, deposits will not be taken. If you want, you check the appendix. So, aggregate turnover definition also we will not take interest on loans, advances, deposits. Then turnover for computing. Look into book, don't look in my face. When I ask you to look, turn your pages, little bit effort you put. So, you are studying, you are not sitting here to watch a movie. You are sitting here to study. Okay, turn the pages, see the last page. So, you can see their aggregate turnover. So, interest on loans, advances, deposits will not be included. Even for 10% limit also, interest on loans, advances, deposits will not be included. Even for payment of GST under composition scheme, interest on loans, advances, deposits not included. So, this is a common point between these 3 turnovers, correct? So, therefore, for computing the 10% limit also, interest will not be included. Then, the tax rate applicable for these services, that is, sir, during the current year, I am providing some service up to 10% limit. So, for these services, what is the rate applicable? I told you, the rate applicable to a trader. What is the rate applicable to a trader? 0.5 CGST, 0.5 SGST on taxable turnover. Then, other procedural provisions. So, how to opt for composition scheme? If I am already a registered person, I need to make application. So, for composition scheme, so in CMP2, when I can go for composition scheme before commencement of the financial year, during the year, that is mid of the year, I cannot go for composition scheme. If I am already a registered person, I need to wait till commencement of the financial year and then only I can go for composition scheme. Suppose if I am not already registered, now only I am getting registered. At any time can I go for composition scheme? Yes. At any time I can go for composition scheme. Along with registration application, I will select the option to go for composition scheme. And every person opting for composition scheme should display composition taxable person in every notice, signboard displayed at the principal place of business and additional place of business, and they are required to file a quarterly return. So that quarterly return is in CMP 8. What is the time limit? By 18th of the month following every quarter. And even they need to pay tax also by 18th of the month following every quarter, means along with CMP 8 they have to discharge the liability as well. And GST will be payable on value as per bill of supply. So there is one concept, generally GST is not payable on advances in case of goods. So because of section 12 subsection 2 read with notification number 66/2017, in time of supply this provision is there, which says that if you are making supply of goods on advances, you are not required to pay GST. GST is payable only on the basis of invoices, but that is not applicable in case of composition scheme. So a person opting for composition scheme is required to pay GST on advances also. So therefore what they need to do is that they need to take the value of bill of supply during the quarter, and they pay GST on quarterly basis. So all bill of supplies during the quarter, value as per bill of supply. Why bill of supply? They will not be giving tax invoice. Why they will not give tax invoice? Because a person opting for composition scheme should not recover the GST from the recipient. So what is the name of the document? Bill of supply. You take the value as per bill of supply during the quarter. Add advances received during the quarter, for which bill of supply will be generated in future, means supplies will be made in future but you received advance, you add, minus advances already received in the past for which bills are raised in the current quarter. So because these advances would have been already taxed in the past, so now we need to reduce that. So this adjustment we need to make. GST payable on value as per bill of supply during the current quarter, add advances received during the current quarter pertaining to next quarter, minus advances received during the previous quarter pertaining to the current quarter. Then a person opting for composition scheme is also required to file an annual return, and that annual return will be filed in GSTR 4 by 30th April of the succeeding financial year. So these are some procedural aspects, and this already we have seen. Validity of composition scheme: if all conditions are satisfied, option remains valid. So we don't have to submit the CMP2 every year. So once we have submitted CMP2, if all the conditions are satisfied, you will be in the composition scheme. Suppose if the conditions are not satisfied, means you cross the turnover limit, or you made supply of service through e-commerce operator, or you made interstate supplies, etc. When conditions are not satisfied, you need to exit from the composition scheme and go for normal scheme, and you need to file one form for exit. For entry, what is the form? CMP2. For exit, it will be CMP4. And that CMP4 you need to file within 7 days from the breach of conditions, and issue tax invoice for taxable supply. Voluntarily also, even if you have not breached the conditions, voluntarily also anytime you can exit from the composition scheme by filing CMP4. Now, whenever you are filing CMP4, exiting the composition scheme, 18(1)(c) will be applicable. So what is that? You were under composition scheme, now you are going for normal scheme. Now you can avail the ITC on closing stock. So along with this CMP4, you need to file one ITC form. What is that ITC form? ITC 1. So CMP4 and ITC 1 is one combination. CMP4 and ITC 1 is one combination. CMP4 is exit from the scheme. When you exit from the scheme, you will avail the ITC on closing stock. And when you need to exit from the composition scheme, whenever you breach the condition within 7 days. And when you need to file this ITC 1 for availing ITC on closing stock, from the day you migrated from composition scheme to normal scheme, within 30 days. 30 days. Then next, the moment you enter into composition scheme, you need to reverse the ITC on closing stock, 18 subsection 4. So the moment you enter into composition scheme, so these two will become a combo. CMP2 and ITC 3. For reversal of ITC on closing stock, we file ITC 3 na. So CMP2 is for entry into composition scheme. When you can enter into composition scheme? So this is entry into composition scheme, intimation prior to commencement of the financial year, and you need to reverse the ITC on closing stock. That reversal of ITC on closing stock is in ITC 3. What is the time limit? Within 60 days from the commencement of the financial year, because you can go for composition scheme only in beginning of the financial year na. The moment you go into composition scheme, from there within 60 days you need to file ITC 3 for reversal of ITC on closing stock. Then mainly these are all tested for MCQ purpose. Suppose you breach the condition but still you are continuing in the composition scheme. So proper officer will give a notice in CMP 5. So proper officer has reasons to believe that taxpayer not eligible or contravene the act or rules. A notice will be given in CMP 5, and within 15 days from notice a reply should be given in CMP 6, and after reply within 30 days, so proper officer will pass a order in CMP 7, either accepting the reply means you will continue in the composition scheme, or denying the composition scheme means you need to exit from the composition scheme. So CMP 5 is notice, CMP 6 is reply to notice, CMP 7 is order, and notice whenever they identify, reply 15 days, and order within 30 days from notice. CMP 8, what is CMP 8? Quarterly return. Quarterly return to be filed by 18th of the month following every quarter. Now whether this denial of composition scheme is prospective or retrospective, whenever we breach the condition and we continued in the composition scheme, department will identify and will give an order. That order of denial will be prospective or it can be retrospective, backdate also, but not before the date of breach. For example, on 18th January we breached the condition and we continued in the composition scheme. Next year they identified that we have breached the condition on 18th of January. Now they can deny the composition scheme prospectively whenever they identify, or retrospectively but not before 18 January, because 18 January only I breached the condition, up to 18 January I am supposed to enjoy the composition scheme. You got it? So in case of denial of option to pay tax under composition levy by the tax authorities, the effective date of such denial shall be from a date including any retrospective date as may be determined by tax authorities. However, such effective date shall not be prior to the date of contravention of provisions of the act or rules. Then, when is it advisable to opt for section 10(2)(a)? So you tell me when it is advisable to opt for 10(2)(a), if I am providing services other than supply of food, or I am providing services beyond 10% limit, then I cannot continue in 10(1). I am providing services beyond 10% limit, then I cannot be in 10(1), so I can go for 10(2)(a). So who is exclusively engaged in supply of service other than restaurant, or who is engaged in supply of services along with supply of goods under a restaurant service of value exceeding 5 lakhs in the current year. Why 5 lakhs? Because my previous year turnover should not exceed 50 lakhs, and 50 lakhs into 10% is what? 5 lakhs or 5 lakhs, whichever is higher, 5 lakhs. If I cross the 5 lakhs of services, I can go for 10(2)(a). Then this is the meaning of various turnover. Already I gave you this table at the end also, and here also for reference purpose I have just given. So aggregate turnover for determining eligibility for composition scheme, turnover for determining 10% limit, and turnover for payment of GST under composition scheme. Here, if you are making non-taxable supplies, export of goods or service, or interstate supply during the current year, you cannot go for composition scheme. So not applicable means these supplies cannot be made during the current year, and if made by the person is disqualified from the composition scheme. Okay. So with this we completed composition scheme. We'll take a break and then we will continue with exemptions and RCM. Okay. Okay. So there are few queries. Let's answer those queries first. Sir, in case of demerger, you said credit shall be transferred in net assets ratio. What if one demerged entity receives entire assets on which ITC not avail and balance by other entity on which ITC avail? Whether ITC availed or not on that net assets, it is irrelevant. For example, I am transferring it to A Limited and B Limited. A Limited I am transferring 4 assets. B Limited I am transferring 2 assets. Now in that case, don't see whether ITC availed or not availed on that assets. So in the assets ratio, we need to distribute the ITC. So whether ITC availed or not is irrelevant. Then next, what will be the value if PA transactions under services? That I didn't understand your question, dear. Then Gaming agency only has to pay GST. Yes, gaming agency only has to pay GST. Problems related to HC block. There are no like questions and all on this. It's only the concept which I already told you through numbers. So that only will be tested. And point 10 2A point B. It is simple here. My previous year turnover is 150 lakhs. So my previous year turnover, if you see, yes. So previous year turnover, previous year aggregate turnover, if you see, is somewhere like 50 lakhs, exactly 50 lakhs. And current year I am a trader. I am a trader. So naturally I would have gone for which composition scheme? Composition scheme under 10.1. Composition scheme under section 10.1. And I want to provide services. What is the limit up to which services can be provided? Limit up to which services can be provided is 5 lakhs, correct? Is 5 lakhs. Now I want to provide more services. So beyond this, then automatically I should go for which composition scheme? 10.2A. So composition scheme under 10.2A, composition scheme under section 10.2A, if services greater than 5 lakhs needs to be provided. Okay. If the services greater than 5 lakhs needs to be provided, we need to go for 10.2A. That is the point which I have explained. Okay, sir, if my turnover during previous year is 60 lakhs, then what is the limit up to which I can provide services? 6 lakhs. Now I want to go beyond 6 lakhs. Is it possible to go for 10.2A? No. Why it is not possible to go for 10.2A? Because previous year turnover is 60 lakhs, which is more than 50 lakhs, which is not possible. So that is that. Then next, sir, if existing composite taxpayer had a turnover of 140 lakhs and provided other than restaurant service for 15 lakhs. So 140 plus 15 means it will be like 155 lakhs. 155 lakhs means they will be disqualified from the composition scheme for the current year, and even next year they cannot go for composition scheme, because for next year this is the previous year na, so next year they cannot go for composition scheme. Then can you please tell us any of these GST concepts also important for IBS? Everything is important for IBS. No, yes. IBS is not separate subject here. IBS is definitely the merger of all the subjects, but I can say that whatever topics yesterday I told you as important, very important for GST, those concepts only are being tested in the case studies. So ICI has released around some 15 case studies, and then 3 case studies in this student journal and 2 case studies in the RTP. So in all these case studies, what I have observed is that they tested only on these areas, whichever areas I said as important yesterday, 10 chapters, 10 topics I said na, from that only, so that only focus for IBS as well. Then next, value of supply when business asset disposed on which ITC avail other than capital goods. No, everything will be covered. Business asset means not only capital goods, even other goods also, current assets also will be coming under that point. Then what will be the transaction value if principal agent transaction under services? First of all, principal agent transaction under services, if it is without consideration, is not a supply. So the activity itself is not a supply. 7.1c DRIP is there na, P for principal agent transaction, that should be only goods. If it is services, it will not be coming. And suppose if it is for consideration, it will come under 7.1a. So 7.1a normal transaction value only will be taken. First of all, principal agent transaction without consideration becomes supply only in case of goods. In that case only we will be applying rule 29. Okay. Then next, so these are the queries they have asked. We are moving on to This supply we will see first, because some students are asking even doubts on supply. So supply we will complete, and then we will see RCM. Otherwise, while discussing RCM, you will ask doubts on supply also. Maybe you guys have not at all studied and you are attending rocket revision here. So see this page number 13. Maybe studied too many subjects now, would have forgot. So possible. I am not blaming you. So look into page 13, supply under GST. So what is the taxable event? Taxable event under GST is supply of goods or services or both, and that supply is defined under section 7. Section 7 of CGST Act. 7 subsection 1 talks about inclusions in the meaning of supply. 7 subsection 2 read with schedule 3 talks about exclusions from supply. 7 subsection 1A is classification of supply into goods or services. 7.3 it is reclassification of supply of goods into supply of service and vice versa. But at present we don't have anything notified for this purpose. So we have only these 3 subsections: 7.1 inclusion, 7.2 exclusions, and 7 subsection 1A classification of supply into goods or services. Now 7 subsection 1, so we have supply includes. In that supply includes we have 7.1A, any activity for consideration in the course or furtherance of business. 3 points, any activity, and that should be for a consideration. It should be in the course or furtherance of business. 7.1AA, any activity between a person other than individual and its members. Again, it should also be for a consideration. Between a person other than individual means HUF, company, firm, AOP, BOI, cooperative society, etc. and members. That is HUF, you take members of HUF, that is co-partners. So there is a karta or other members of the HUF. Between HUF and them any activity, or between firm and partners any activity, between company and the shareholders any activity. So between them for a consideration it will also become supply. Then 7.1b, import of services for a consideration whether or not in the course or furtherance of business. So you are importing services for a consideration, it may not be in the course or furtherance of your business, even then it will become supply under 7.1b. 7.1c comes under activities in schedule 1 even though without consideration. When there is no consideration, then only you need to refer to 7.1c. In 7.1c we have 4 activities: D, R, I, P. D for disposal of business asset. This business asset can be capital goods or other than capital goods on which ITC has been availed. R for related party transaction including transaction between distinct persons. I for import of services from a related person or another establishment located outside India. Then P for principal agent transaction with respect to goods. Okay, principal agent transaction with respect to goods where agent is acting on behalf of principal. So these are the 4 activities, and in detail, so this 7 subsection 1 difference table you can see in page number 15. So in 7.1a any activity, and consideration should be there. Course or furtherance of business. From whose perspective we need to see whether it is in the course or furtherance of business or not? Supplier point of view. And the coverage is both goods and services. 7.1AA. What is the difference between 7.1A and 7.1AA? Everything is same except that 7.1A is between any person to any person, but 7.1AA is between a person other than individual and its members. So now there is a partnership firm which is giving some remuneration to the partner. Whether that will come under 7.1AA. So it will not come under 7.1AA, it is nothing but withdrawal of profit. But if there is a separate contract between the partner and the partnership firm, where partner provides some services to the partnership firm, for which partnership firm will pay some amount of consideration to the partner, then it will come under 7.1AA. But mere remuneration arising out of the partnership deed is withdrawal of profit. That will not come under supply, okay, because this point can be tested in the exam. So what is it we have to see here? What is it we need to understand? So remuneration to partner, remuneration to partner, to a partner by firm is withdrawal of profit, and not a supply, However, consideration to partner to partner for services provided to firm is supply under section 71AA. So the 71AA mainly come into picture in case of activities between a person other than individual and its members, either members to the person or person to the members anyway. One more example is a company which is providing share transfer to the shareholder. So shareholder requests the company to transfer the shares from his name to some of his relative name or his wife's name, for which there is a share transfer fee which will be collected by the company. So this share transfer fee collected from the shareholder also will come under supply 71AA. So basically 71AA is between any person to any person. 71AA is between a person other than individual and its members. Then 71B, what is the difference between 71A and 71B? In 71B only one activity is there, that is import of services. Consideration, yes, and it may or may not be in the course or furtherance of business. And 71B import of service should always be interpreted from the recipient point of view. For example, you are importing Amazon Prime or Netflix OTT platform services for which you will make some payment. So it is import of service for a consideration, not in the course or furtherance of your business. Even then it will become supply under 71B. And 71B the coverage is only services. Then 71C, DRIP, D for disposal of business asset. In that all these four cases consideration is not required. But in case of disposal of business asset, whether it should be in the course or furtherance of business, it may or may not be in the course or furtherance of business. We are disposing the business asset. It may be related to CSR obligation, or it may be to an employee under employee welfare, or it may be to an outsider not in the course or furtherance of business. But if you dispose of the business asset on which ITC is availed, it will become supply. And here supplier point of view and the coverage is only goods, whereas related party transaction should be in the course or furtherance of business. Supplier point of view, coverage is both goods and services. Import of services, wherever import of services comes, so always we need to see it from the recipient point of view. What is the difference between import of service under 71B versus import of service under 71C? Import of service 71B should be for consideration, here it is without consideration. Here it is may or may not be in the course or furtherance of business, but here it should be in the course or furtherance of business. And principal agent transaction only goods, coverage is only goods, service is not there, and it should be in the course or furtherance of business from supplier point of view. This is about inclusions, and whenever you are referring to 71C, you need to write read with schedule 1. And then when an activity will be excluded from supply, so as per 7 subsection 2, supply excludes. So this is read with schedule 3. So you need to remember spelled slow. Yes, for sovereign functions of government, that is all activities of government other than the following is excluded from supply. Only 4 activities of government is covered under supply. What are those 4 activities? Department of Post, transportation of goods or passengers, and airport or port services, and services to business entities. These are the 4 activities which are covered under supply, and all other activities of government is excluded from supply. P refers to post, post that is constitutional post, government post or nominated post. Government post means MLA, MP, etc. Constitutional post means President, Governor, Supreme Court Chief Justice, etc. Then nominated post means there is a body where the head of that body or any member of that body is nominated by the government. So that is nominated post for which government will pay money to them. That will also be coming under exclusion. Example, RBI Governor, SEBI Chairman, or any nominee director appointed by government in the company, government company. So all these are nominated post. Then that is also excluded from supply. SPA, A for actionable claims other than specified actionable claims. So what are the specified actionable claims? HC block. So horse racing, casinos, betting, lottery, online money gaming and gambling. Okay. Here this online gaming basically will not come under specified actionable claims. So this online gaming will not come, only online money gaming, because online gaming is shifted to OIDR services due to that reason. So online gaming falls under OIDR services. OIDR services. Then gambling. So this will be coming under specified actionable claims. So previously lottery betting and gambling was there, and now they have changed it to specified actionable claims. So yes, sovereign functions. P post. A, actionable claims other than specified actionable claims. L, legal fees. Legal fees collected by whom? Collected by court or tribunal. And L, land sale. Any sale of land is excluded from supply. Even sale of building is also excluded from supply. But when sale of building is excluded from supply, when entire consideration is received after obtaining completion certificate or first occupation, whichever is earlier. And then E for employee to employer in the course of employment. So employee getting salary from the employer will be excluded from supply. D for death related, that is funeral, burial, mortuary, transportation of deceased, etc., that will be excluded. This is about SPALT. Then slow. S for sale on high seas, that is we are importing the goods. Before the goods being imported, we sold these goods by way of transfer of documents to title to some other person. Now whatever money that we receive is known as sale on high seas. So that is excluded from supply, because the subsequent buyer is going to file a bill of entry and pay the customs duty along with IGST. So our sale is excluded from supply. That is known as sale on high seas, that is sale before import. Then liquor license granted by state government. State government will be giving license to sell liquor to various people, and for which they will collect a license fee. That license fee is also excluded from supply. Then outside the country movement of goods. Supplier is located outside India, and like supplier is in India, recipient is in India, but the goods are moving from outside India to India. For example, it's like I am person located in India, you are my recipient located in India, and I have a branch in Australia. From my branch in Australia, the goods are coming to India, then it will be import of goods. Import of goods is covered, but not in GST, it is covered under customs. Okay, that's why in GST we don't have any discussion related to this. But what is this point? Outside the country movement of goods means goods originate outside India, terminates also outside India. Means you have a branch in Germany, I have a branch in Australia. From my branch in Australia to your branch in Germany, the goods are moving, but the financial impact of the transaction is happening in India. Even then, it will not be chargeable to GST, it will be excluded from supply. Then warehoused goods sold under customs, we saw that in input tax credit. Warehoused goods in the sense like, so I have deposited the goods in the warehouse. I am the importer, I imported the goods, I kept the goods in the warehouse, and thereafter I transfer the document of title to you, warehouse receipt to you. Now you will pay some money to me, I will not pay any GST on that, because anyhow when you clear the goods from the warehouse, you pay the customs duty along with IGST. So I am excluded from supply. That is the sale of warehoused goods under customs. So these are the activities which are excluded from supply. Whenever you write exclusion from supply, you write section 7 subsection 2 read with schedule 3. Then see one more point here, gifts by employer to employee. Employer and employee are treated as related parties. If employer is giving any gift to the employee, and if the value of the gift does not exceed 50,000 per annum per employee, then also it is not a supply. What if the value of the gift exceeds 50,000? Entirely it will be treated as supply and chargeable to GST. Then next one, so there is like when an activity becomes supply or not. First you need to check 7 subsection 2. If the activity is covered under 7 subsection 2, it is not a supply. So first you need to check while reading the question. So you see the activity. The first thing you need to see is that, is the activity given in the question covered in 7 subsection 2? Yes. If it is covered in 7 subsection 2, it is not a supply. If it is not covered in 7 subsection 2, no. Then you check 7 subsection 1 inclusions. Is it covered anywhere in 7 subsection 1? Yes. Then it will become supply. If it is not covered under 7 subsection 1 also, then it is not a supply. You need to write that the said activity is not a supply. So first you need to see the activity or a transaction. This activity or a transaction, okay, is covered in 7 subsection 2. Is covered in section 7 subsection 2 read with schedule 3. See, this is how you need to interpret in the exam. Okay, that's why I am giving you. First you need to see the activity or transaction given in the question and check whether it is covered in 7 subsection 2 read with schedule 3. Yes, it is covered in schedule 3. Then what will be your answer? If this is yes, is it supply or not a supply? It is not a supply. So what is it you need to write in exam? The said activity. First you need to write as per 7 subsection 2 read with schedule 3, employee to employer in the course of employment is excluded from supply. In the present case, employee getting salary, therefore it is not a supply. Like that you will write. Okay. Suppose if it is no, it is not covered in schedule 3, that is 7 subsection 2 read with schedule 3. Then you check whether the activity or transaction is covered in section 7 subsection 1, that is inclusions anywhere, either 71A or 71AA or 71A or AA or 71B or 71C, anywhere it can be covered, okay, anywhere it can be covered. Suppose if the answer is yes, it is covered in 7 subsection 1, then what will be your answer? If this is yes, the activity is supply. Suppose if it is no, it is neither covered in 7 subsection 2 nor covered in 7 subsection 1, then also the activity is not a supply. So what is it you will write? Say for example, disposal of business asset on which ITC not availed. So now you will write as per 7 subsection 1 C, disposal of business asset on which ITC availed is supply. In the present case ITC not availed, consequently the said activity is not a supply, like that you will write. And this 7 subsection 2 is called as neither supply of goods nor supply of services. That is the correct name which is given in the law. So the name for this is neither supply of goods nor supply of services. So this is the correct name that is given in the law, okay. So you write that not a supply, but not a supply is generic, but specifically it is neither supply of goods nor supply of service. Why? Because in one MCQ, one attempt they have given this, transaction in securities is dash. Option A, neither supply of goods nor supply of services. B, not a supply. Both are correct. Neither supply of goods nor supply of service is also correct, not a supply is also correct. So which should be taken as the answer? Not a supply. So neither supply of goods nor supply of services will come into picture when only when the activity is excluded from supply as per 7 subsection 2 read with schedule 3. That's spelled slow. In the case of that spelled slow only, you need to write neither supply of goods nor supply of services. In other cases and all, you should write it as not a supply, okay. So therefore that is how. Now once the activity becomes supply, what's next? So the next aspect is that you need to check, is that activity taxable or exempted? So that is the next aspect. But do we have taxable list? No, we have negative list only, means we have what are all exempted. So the balancing figure will be taxable. So where is that exempted? We need to check whether the said supply is exempted. Whether the said supply is exempted. Where we need to check for that? Section 11 read with notification. One notification is there where they have given list of services. What is it? Notification number 12 of 2017. So this is for services. Sir, what about goods? Goods related exemption we don't have, so you don't have to remember. Goods related exemptions is not in syllabus or not required. Whether the said activity is exempted. If it is yes, so activity is supply, but it is exempted. If it is yes, then whether GST payable or GST not payable? GST not payable. Now what is the explanation that you will write? Because majority of the answer sheets that I have seen and what I have observed is that every student who shared with me the answer sheet, they are writing correct answers only, but the explanation is pathetic. They are not writing the reason, proper reason they are not writing. So whatever is analysis in your mind, that should be written in the answer sheet, otherwise you will not get marks. So don't expect full marks and all when you are not writing proper justification. So now what is the justification you will give? You will say that even though the said activity is supply, but the same is covered under section 11 read with notification 12 2017, therefore it is exempted and consequently GST not payable. Like that you should write, okay. So develop the habit of writing. We have ample time now that the revision get over. So try to solve more and more questions and write the answers. Then only you will know as to how that should be presented in exam. Okay. Justification is very, very important. You remember, it's like you are married. and you need to give explanation to your wife. How you will give explanation? Everything. You sit, you give explanation. Stand, you give explanation. You sleep, you give explanation. You come late, you need to give explanation. Out of experience, I am telling you. Therefore, everything you think you have to give explanation. You understood? In your life, you think like that only in exam hall also. So in exam hall also, you read something, you write something, for that you need to give explanation. Justification is important here in life, you understood? So that you have to write in the answer sheet. If you are not giving explanation, your life will be hell. Your answer sheet also hell, you understood? So please ensure that properly you are giving. So this is the explanation that you will give. What is that? The activity is supply, but it is exempted, okay? So consequently GST not payable. Suppose if it is no, it is not exempted, then what is the answer for this? The said activity is taxable. So supply, it is a taxable supply. It is a taxable supply. If it is a taxable supply, what is the next thing that you need to see? Who is liable to pay GST? The next aspect is who will be liable to pay GST. So for that you need to check RCM. FCM is not there. FCM is balancing figure. So whether the said taxable supply, is covered under RCM. RCM means reverse charge mechanism. So where we need to check, in case of goods, you need to see section 9(3) read with notification number 4 of 2017. So goods related provisions we have for exam. Then services. If it is services, section 9(3) read with notification number 13 of 2017. Sir, should we remember all these things? Then why am I writing? Am I an idiot or what to write all these things? I have a lot of work to do, but I am writing it because important. You have to remember this. Don't put a question there. Should we remember all these things? Remember. You are writing CA final exam. At least this you remember. Okay. So that the valuer will think you are a knowledgeable person. Okay. Because you are writing notification numbers and all and section numbers and all. Remember, nothing wrong. So goods notification 4 2017, services notification 13 2017. Suppose if it is covered under RCM, if the answer is yes, okay, if the answer is yes, so who will pay GST? Liability to pay GST is on. Liability to pay GST to government. To pay GST to government is on recipient. Suppose if it is no, it is not covered there, then who will be having liability to pay GST? Liability to pay GST is on supplier. Now wait, we cannot conclude here. One more aspect you need to see. Whenever the liability to pay GST is on the supplier, check whether that supplier is required to get registered or not required to get registered. That's the fourth aspect. The first aspect you need to see is whether an activity is supply or not. The second aspect you need to see is whether it is taxable or exempted. The third aspect you need to see is who will be liable to pay GST. The fourth aspect is registration. So if the supplier is not required to get registered, then GST not payable. So therefore, in this, whether supplier is registered or liable to get registered, if this is yes, then who will pay GST? Supplier shall pay GST to government. Suppose if it is no, If it is no, GST not payable. If it is no, I am just connecting to this, or separately also you can write. If it is no, if it is no, GST not payable. So what you need to write, don't change the service as exempted. The said activity is taxable and it is coming under FCM, but as the supplier is not registered, GST not payable, like that you need to write. And suppose if the transaction is covered under RCM, then what will happen? Liability to pay GST is on recipient. For recipient also should we check? Yes. Is the recipient exempted from registration? You check. If the recipient is exempted from registration, compulsory registration is not applicable. Otherwise, the recipient is liable to pay GST. Okay. So, therefore, the next aspect that we check here is whether recipient is exempted from registration. Recipient is exempted from registration. If the recipient is exempted from registration, if this answer is yes, GST payable or GST not payable? GST not payable. If the answer is yes, GST not payable. Suppose if the recipient is not exempted from registration, no, then compulsory registration. Compulsory registration and recipient shall pay GST to government. And wherever this GST not payable, in this place, you remember section 23 overrides section 24. Section 23 talks about exemption from registration, section 24 talks about compulsory registration. So therefore, section 23 overrides. If a person is exempted from registration, section 23 overrides section 24, so they are exempted from registration and GST not payable in this case. So this is how you need to analyze a transaction and you need to arrive at the answer. Okay. So accordingly, here we need to check that. That's what I have given. If an activity is not covered in 7 subsection 2, exclusions, then 7 subsection 1 should be checked. If the activity is not in 7 subsection 1, then the activity is not a supply. Then you can see circulars related to exclusions. There is one point, sale of land. So this sale of land is usually excluded from supply, but I am not selling the land as such. I am selling the developed land. In that case, what is the treatment? If the developed land is sold and if a single consideration is collected towards the sale of land, so I will buy a piece of land which is like a undeveloped land. I will do the leveling and I will put it like a plots and I will lay down the roads. I will put the electric connection, pipeline, water pipeline, etc. and all. Now the developed plot I am selling. So like plots, 1200 square feet or 500 square feet, 800 square feet, like the developed plots I am selling. Now I charge a single consideration like 3000 rupees per square feet, everything, all inclusive. Now in that case, this 3000 rupees will be excluded from supply. Suppose if I charge 1800 rupees per square feet for land, 1200 per square feet for development charges. I developed the land now, so I incurred some charges. Suppose if I bill it like that. Now 1800 rupees per square feet for sale of land is excluded from supply, but the 1200 rupees per square feet for development charges, so that will be covered under supply. That's what circular says. Sale of land after some development such as leveling, laying down of drainage lines, electricity lines, etc. is also sale of land is excluded from supply. However, services provided for development of land is not excluded from supply and shall attract GST. So towards development charges, if we collect some amount, that will attract GST. Then another point is related to perquisite. If any perquisite is given by employer to employee, that will not be treated as gift. So the difference between perquisite and gift is that perquisite will be covered under the offer document, whereas gift will not be covered under offer document. So for gift only you need to check that 50,000 rupees point. For perquisite, whatever may be the amount, it will be excluded from supply. Why perquisite excluded from supply? Because perquisite will be coming under salary. It forms part of salary. So perquisite given by employer to employee in terms of contractual agreement entered into between them will not be subject to GST when the same are provided in terms of contract. Then next, you can see some important definitions below. See page number 15. So first definition is related to goods. So goods is given under section 2 clause 52. So goods means any kind of movable property. So that will be coming under the meaning of goods. So immovable property will not come under goods, and this includes actionable claims, growing crops, grass and things attached to or forming part of land which are agreed to be served before supply or under a contract of supply. So actionable claims will come under goods. Which actionable claims? All actionable claims. But out of these actionable claims, other than specified actionable claims are excluded from supply. Same way, anything which is attached to earth like trees, plantations, etc. will also come under goods. If we have agreed to sever it, cut it before delivery, so then it will be treated as goods. And goods excludes money and securities. Not only goods, even service definition also excludes money and securities. So money and securities is neither goods nor services. And services means anything other than goods will be coming under services, and services includes, generally service excludes money, but transaction in money for a separate consideration will be included in the service. And service excludes securities, but facilitating or arranging transaction in securities is treated as service. Example, stockbroker service, depository service, etc. It is not sale of securities. Sale of securities excluded from services as well as goods. But transaction in securities, facilitating or arranging transaction in securities means stockbroker service, depository service, underwriting service, etc. will be coming under services. Then transaction in money for a separate consideration. I have 500 rupee note, I am giving you and you are giving me 500 rupee notes. It is transaction in money without consideration. It is neither goods nor services. Suppose if I am giving you 500 rupee note and you are giving me 400 rupee notes and 150 rupees note, and 50 rupees is a commission for you, means separate consideration, that will be treated as service. Which will be treated as service? That 50 rupees will be treated as supply of service. And what is the meaning of money? Money is Indian currency or foreign currency or any instrument recognized by RBI, but does not include old currency which is not in the circulation. So currency means what? Indian currency or foreign currency. Includes any instrument recognized by RBI. But old currency will not come under money definition. So sale of old currency will be treated as sale of goods and it will attract GST. Even cryptocurrency. Cryptocurrency is also not treated as instrument recognized by RBI, correct? So therefore sale of cryptocurrency also treated as supply of goods and it will attract GST. Okay. So sale of old coins, sale of old coins, sale of old coins, or sale of cryptocurrency, sale of cryptocurrency treated as sale of goods and attract GST, attracts GST. Then next, so remember, securities, transaction in securities is only not goods or services, but any other activity connecting to securities. So any other activity connecting to securities is what? So we have, this security, lending, like that one concept is there. Security lending means we are renting the securities or lending the securities. That is not transaction in securities, not sale of securities. We are just lending the securities. That will be coming under facilitating or arranging transaction in securities. Okay. Then next, actionable claims. Actionable claims means any instrument which entitles right to receive a benefit. So 4 conditions should be satisfied, then only it will be called as actionable claims. What are those? First, you should have an instrument that will give you right to receive a benefit or recover a debt that can be transferred from one person to another person, and it is legally enforceable, and the holder of that instrument is entitled to receive the benefit or recover the debt. Then it will be called as an actionable claim. So bill of exchange, promissory note, check, lottery ticket, and even in casinos the chips are there na, all these are called as actionable claims. But in this actionable claims, if it is covered under money definition, because check, bill of exchange and promissory note is covered under money definition. As it is covered under money definition, it is neither goods nor services. Say this: actionable claims which are covered under money definition, that is bill of exchange, promissory note and bearer check, it is neither goods nor services, whereas other actionable claims are treated as goods. In this other actionable claims, so this specified actionable claims is covered under supply, and other actionable claims are not a supply. Okay. Then, so what is this specified actionable claims? Online gaming will not come under specified actionable claims, I told you. So online gaming means offering a game on the internet or electronic network and includes online money gaming. But online gaming other than online money gaming will come under OIDR services. Online money gaming, so basically these three are online gaming. Okay. Online gaming will be treated like OIDR services. Okay. Then online money gaming, so means online gaming in which players pay or deposit money or money's worth, including virtual digital asset. This is a highlight point in the expectation of winning money or money's worth. That should be there, then only it will be called as online money gaming. In online money gaming, there should be expectation to win the money, including virtual digital assets in an event, including game, scheme, competition or any other activity or process, whether or not its outcome or performance is based on skill, chance or both. So let it be a game of skill or game of chance. Game of skill. So definitely certain games will be game of skill. Chess, online chess is a game of skill. So people put bet on that and all, and they will play and they will win the money. So it's a game of skill. Definitely it's not a game of chance. Whereas Ludo is a game of chance. There is no skill involved in that, because that dice when you throw, you don't know na, which number will be coming. So it's a game of chance. So then there is a dispute like Dream 11. So whether it is a game of skill or a game of chance. So for which, they have made this amendment. So if it is a game of chance, it will come under betting and gambling. If it is a game of skill, it will not come under betting or gambling. That's why they included both in the definition now. Whether it is game of skill or game of chance, everything will come under online money gaming. So they need to pay. And on Dream 11, they served a 9,000 crore, not 9,000, 90,000 crore, sorry, 90,000 crore tax demand has been served on them. Okay. So to pay the GST. And they ran away. So whether or not its outcome or performance is based on skill, chance or both, and whether the same is permissible or otherwise under any law for the time being in force. So this is about online money gaming. And then meaning of consideration. So we have seen meaning of goods and meaning of services. Look into the meaning of consideration that is given in section 2 clause 31. Consideration includes and consideration excludes. Consideration includes either monetary or non-monetary. Monetary means what? Payment received or receivable. Non-monetary means it can be in the form of goods or it can be in the form of services. That is not important. But consideration excludes what? Consideration excludes refundable security deposits and subsidy from central government or state government. So these two are excluded from consideration. And consideration can be received from recipient or any other person. What we need to see is presence of consideration. Example, yesterday we have seen that dealer will be providing free after sale service, which he will recover it from the manufacturer. So he is not getting money from the buyer, but he is getting money from the manufacturer. So whether he gets money from the buyer or he gets money from the manufacturer, there is a consideration that is involved in the transaction. So therefore, it is treated as consideration, not necessary that it should be received from the recipient. and consideration should be in respect of, in response to, or for the inducement of supply of goods or services. In respect of means we will tell in the beginning itself, like this is the activity, this is the consideration, this is the amount that you need to pay for it. It is known as in respect of. Whereas in response to, so we are not committing any amount, but for that activity in response to some amount is received. So example, I told you, usually this actors and all will be receiving car, etc. as gift from the producer for acting in the movie. So once a movie becomes hit, producer will give the car as a gift. Is that car coming under consideration? Yes, in response to acting in the movie. Had the person not acted in the movie, he will not receive it now. So therefore it will be coming under consideration. And inducement of means offering some gift to make the work done. So that gift given to make them sign a contract will also come under consideration, that is known as inducement of. Then activity without consideration or consideration without activity is not a supply under 7(1)(a). So activity without consideration, so like for example, I am taking classes now and I am not collecting 1 rupee also from you. So therefore it is activity without consideration. Is it supply or not a supply? Not a supply. And consideration, sir, tomorrow because of this you will be getting some students and therefore they will be purchasing your lectures. I don't think so. So because there is no guarantee, certainty element should be involved. There is no certain element here. Probable and all cannot be called as consideration. So therefore there is no consideration, consequently it is not a supply. Same way, consideration without activity. What is an example for that? Donations. So we are getting some money, but in return we are not doing anything for that. So then it will also not be treated as supply. What if we got a donation and in return we are doing something? So for that donation, then it is called as a conditional donation. Conditional donation will be treated as supply. So basically donations are divided into two: conditional donations and unconditional donations. Conditional donation means obligation on supplier to do something, whereas unconditional donation means no obligation on supplier to do anything. So therefore conditional donations means you are giving me some money and you are putting a condition on me to do something for you. You display my name somewhere on the top of the building. So I am doing the donation for it. It is known as what? Conditional donation. So means I have an obligation to do something for you. So this conditional donation is treated as consideration and the activity will become supply under 7(1)(a). Suppose if it is unconditional donation, you are giving me donation and you have not made me obliged for anything, means I don't have any obligation to do anything in return to you, then it will be unconditional donation, not treated as consideration, consequently it will not become supply. Now, you gave me money and you have not asked me to display your name anywhere, but as a gratitude I displayed your name. Is it conditional donation or unconditional donation? Unconditional donation. However, CBSE circular says display of name gives a business advantage to the donor. By displaying your name, you are getting a business advantage. Then it is deemed to be conditional donation and it will become supply. If donor name is displayed anywhere in the premises against the donation, not obligated, but as a gratitude it is being done, display of name does not give business advantage to the donor, not a supply. So I have just mentioned donated by, so Mr. Ram, nothing else. So therefore it is not treated as conditional donation. Unconditional donation, not a supply. So donated by Mr. Ram, proprietor Ram Fancy Stores, like that I have mentioned. Now in that case, so display of name gives a business advantage to the donor, therefore it will be coming under supply under 7(1)(a). Display of name gives business advantage to the donor. Okay, then and I just said Ram as a person name, not that Jai Shri Ram. You understood? So people, those who are watching these lectures, don't put in the comment and all something. Okay, I didn't mean anything about that, because if I speak anything it is going in some other sense. Okay, now coming back to this meaning of person. Meaning of person, so person under Income Tax Act, so we already know that is individual, HUF, company, body corporate or firm, everything will come. But extra we have central government and state government also, that is called as person under GST. So this is person under Income Tax Act, individual, HUF, company, firm, AOP, cooperative society, local authority, artificial juridical person and any other body corporate. Extra extra central government or state government, so that is called as person under GST. Sir, if we use Dr. Ram, then will it be coming under supply, sir, deemed supply? No, yaar, because Dr. Ram can be any person. They are not specifically giving. Suppose if you mention Dr. Ram and clinic name, his clinic name will be there na. That clinic name if you put automatically it will be coming under business advantage. So your name, because you will be having too much fancy towards CA and all. The moment you qualify CA, everywhere you will put a CA like that your name, because you like that. It's your effort, you have made lot of effort in getting that CA, nothing wrong in that. So you will put everywhere, in wedding card and all you will put. And suppose if, because one invitation has been given, in that invitation that person is asking, no, my name only mentioned, where is CA, before that CA. So took the wedding card or invitation, CA, so and so, then only his ego got satisfied. So therefore people are like that. Now you donate, when you donate it, they will put your name, but you want them to put CA like that. Just because of this, you are not getting any business advantage. Suppose if your name along with your firm name comes, you will have a firm name na. If the firm name is mentioned, then there is a business advantage like that. Then meaning of business. So business definition is relevant because there are many places we have in the course or furtherance of business, not in the course or furtherance of business, etc. So there is a general meaning of business and there are some specific activities. What is the general meaning of business? Trade, commerce, manufacture. First three, trade, commerce, manufacture. Next three, profession, occasion, adventure. These are related to skills. Profession is by way of qualification, occasion is by way of experience, adventure is as a passion you are doing it, and wager. Wager refers to betting activities or any other similar activity. So these 8 activities, trade, commerce, manufacture, profession, occasion, adventure, wager or any other similar activity. Its incidental or ancillary is also covered. So there is a chartered accountant who takes classes and he gets some money, that will be incidental or ancillary to his profession. And he authors a book and he gets some royalty income, that will come under incidental or ancillary to his profession. And he takes seminar and he gets some fees for giving lectures in seminar, so that is also coming under incidental or ancillary to his profession. Suppose if he starts acting in movie, that will come under adventure, because it is no way connected to his profession, that's a different skill, as a passion he is doing that, so that will come under adventure. So extension of these activities is incidental or ancillary. Altogether a different skill will be coming under adventure. Then irrespective of volume, frequency or regularity, sir, only one transaction we made, let it be, that is also treated as business. Whether or not for a pecuniary benefit, sir, there is a charitable trust. That charitable trust is selling some goods, but not for profit motive. Even then it is business, yes. Whether or not for a pecuniary benefit, whether it is for not profit motive or profit motive, it is business. Then there are some specific activities. First one, entry tickets. Entry tickets like admission to cinema theatre, admission to park or admission to museum, admission to temple, etc. All these are treated as business. Then holding an office which is accepted by a person in the course or furtherance of his trade, profession or occasion. So there is a trader who became a head of a trade union for which he is getting some money, so that will be covered under business. And then there is a actor who became head of a artist association for which he is getting some money, so that will also be coming under business. And there is a professional like a doctor who became head of the medical association for which he got some money, that is also coming under business. So holding an office which is accepted in the course or furtherance of your trade, profession or occasion. Suppose there is a doctor who became secretary to a temple, and for becoming secretary to the temple he got some money. Will it come under business? No. Why it will not come under business? It is not in furtherance of his trade, profession or occasion. Then next, supply of goods or service in connection with commencement or closure of business. So at the time of commencement of business, I do some activity that is not actually my business. For example, I purchased 10 ACs, and out of the 10 ACs, 4 ACs I used in the business, 6 ACs I am selling. That sale of 6 ACs is not my business. Even then it is in connection with commencement of business, so therefore it will be treated as business. I am shutting down the business. When I shut down the business, assets and all I will sell. Sale of assets is not my business, but it is in connection with closure of business, so that will also be coming under business. Then provision of facilities or benefits to its members by a club, society or association. There is a resident welfare association, that's apartment owners association. This apartment owners association will be incurring common area expenses like lift maintenance, parking maintenance, security, garden, etc. And they will be recovering the money from the members in the form of maintenance charges. So that will also be coming under business. Then any activity of a race club, including betting activities, all activities of race club, betting activity anyhow coming under business, but all other activities like supply of food and beverages to the people who come over there, and supply of merchandise, parking tickets, all this will come under business. And all activities of government is also business. But in these all activities of government, only few activities of government is covered under supply, and remaining activities are excluded from supply. What are the activities of government covered under supply? Department of Post, transportation of goods or passengers, airport or port, and services to business entities. This is covered under supply, and remaining activities are excluded from supply. But all activities of government come under business. Then next one, meaning of related. What is the purpose of related parties? So two places we will come across related in supply definition. 7(1)(c), R and I. Related party transactions, including transaction between distinct persons there, and import of services from a related person. In these two places we come across related. Whenever there is a transaction between related parties, even though without consideration it will become supply. And one more impact also is there, rule 28 will be applicable. Transaction value will not be applicable, and we need to determine the value as per rule 28. So transaction value under section 15 not applicable, and value determined in terms of rules. And total 9 relationships are there, and they will be treated as related. So first point, such persons are officers or directors of one another's business. So for example, X is appointed as officer of Y's business, and Y is appointed as officer of X business. Now X and Y are treated as related. And in this one more point also I have told you, director of a company and such company are also treated as related. So first point, such persons or officers or directors of one another's business. Second point, such persons are legally recognized partners of a firm. So there is a partnership firm. In that partnership firm there are 3 partners, A, B and C, and this is a legally recognized partners. Means what? That firm should be a registered partnership firm. There are 3 partners, A, B, C. A and B are related, B and C are related, and A and C are related. But the firm and partners are not related. Partners in a firm are related, however partners and firm are not related. Then such persons are employer and employee. Employer and employee are also treated as related. So first 3 points you should remember. Such persons are officers or directors of another's business. They are legally recognized partners of a firm, employer and employee. Next 3 points is related to control. So point number 4, there are 2 companies having a common shareholder. We holding 25% or more in these 2 companies. Now these 2 companies are treated as related. So any person directly or indirectly owns, controls or holds 25% or more of the outstanding voting stock or shares of both of them. And same point, same 9 points are there in related definition in customs also. But the difference is that here 25% is there na, whereas in customs it will be 5%. Okay. So in customs, for this 4th point, in customs, 25% replaced with 5%. So no need to remember separately for customs, the same definition is there even for customs related parties. Then 5th point, one of them directly or indirectly controls the another. So when there will be control, control can be by way of investment. Investment more than 50%, there is a control, or control can be by way of majority common board of directors. For example, 2 companies, company A and company B. For company A, X, Y and Z are the directors. For company B, it is X, Y and P are the directors. Now these 2 companies, 2 out of 3 directors are common, majority are common, therefore these two companies are having control, so therefore they are treated as related. So either investment greater than 50% or majority common board of directors, or it can be control of operations. One company controls the operations of the another company, even though investment is not more than 50, even though there is no majority board of directors, even then they will be treated as related. Then point number 6, both of them are directly or indirectly controlled by a third person. So two companies having a same parent company. So X Limited, Y Limited. X Limited is under the control of A Limited, Y Limited is also under the control of A Limited. Because these two companies are having the same parent company, these two companies are treated as related. So what are the first 3 points? Such persons or officers or directors of another's business, they are legally recognized partners of a firm, employer and employee. Next 3 points, two companies having common shareholder holding 25% or more. One company directly or indirectly controlling the another. Third point, two companies are under the common control of a third person. Then last 3 points, point number 7, together they control a company. So there is a company having many shareholders, but you take 2 shareholders, because always relationship we will see between 2 parties, supplier and recipient. So you take any 2 shareholders. Those 2 shareholders are having investment more than 50%. Now those 2 shareholders controls the company. Now these 2 shareholders are treated as related. So together, individually they may not control the company, but together they control the company. So these 2 shareholders will be treated as related. Then point number 8, they are members of the same family. So family is defined in GST, but family is not defined in customs. Family not defined in customs. Family not defined in customs. So what is the meaning of family for the purpose of GST? So family means parents, grandparents, brothers and sisters who are wholly and mainly dependent on that person. Whereas spouse and children, whether or not dependent on that person. Spouse and children, not necessary that they should be dependent, always family. But remaining means brothers, sisters, parents, grandparents, they should be wholly or mainly dependent on that person. Then sole agent or sole selling agent or sole distributor, they are also deemed to be related. Now there is a transaction between a principal and his sole selling agent. Whether we need to determine value as per rule 28 or rule 29, we need to determine the value as per rule 28. Generally principal agent transaction rule 29, but sole selling agent is related. When the sole selling agent is related, we need to determine the value as per rule 28. Okay, so transaction between principal and sole selling agent. Principal and sole selling agent. Which rule? Value under rule 28, not 29. Value will be under rule 28, but generally principal agent transaction will come under rule 29, but in this case as sole selling agent is related, you should apply rule 28 only. So these are the 9 points related to related definition. The next meaning of various supplies. We have taxable supply, exempted supply, non-taxable supply and zero rated supply. What are considered as zero rated supply? Supply of goods or services to SEZ or export of goods or services is known as zero rated supply. What are non-taxable supply? Alcoholic liquor for human consumption and 5 petroleum products will come under non-taxable supply. What are exempted supply? For payment of GST, 3 exempted supply, notified as exempted, nil rated and non-taxable. And the remaining balance is known as taxable supply. Whether taxable supply includes exempted supply? No. So supply of goods or services divided into 2, chargeable to GST, not chargeable to GST. Why is it not chargeable to GST? Maybe it is not leviable to GST, that is non-taxable, or maybe leviable to GST but nil rated, rate of GST nil, or it may be like notified for non-payment. All these 3 will come under exempted. So what is the meaning of exempted supplies? Notified for non-payment, notified as exempted, nil rated, non-taxable. So the balancing figure is taxable supplies. Means whether taxable supplies includes exempted supplies? No, because exempted supplies includes non-taxable supply. So taxable supplies do not include in its ambit exempted supplies. Then meaning of aggregate turnover, just now we have seen aggregate turnover definition. So what and all will come in aggregate turnover? All these four will come in aggregate turnover: taxable supply, exempted supply, non-taxable supply and zero rated supply. But what are excluded from aggregate turnover? Inward supply on which GST is payable under RCM, because basically turnover means outward supply. So inward supply, even though you pay GST, it will not come. And CGST, SGST, IGST and compensation cess also will not come in aggregate turnover. Then next point you see, GST on sale of flats and buildings. Generally, when it will be excluded from supply, sale of building, if the entire consideration is received after obtaining completion certificate or first occupation, whichever is earlier. So now, if entire amount is received before completion certificate or first occupation, covered under supply or excluded from supply? Covered under supply. If entire amount is received before obtaining completion certificate, covered under supply, GST payable, and it will be treated as works contract service. If entire consideration is received after obtaining completion certificate, then it is excluded from supply, GST not payable, and we treat it as sale of immovable property. What if part consideration is before completion certificate and remaining consideration after completion certificate? Whether it is covered under supply? Yes. When it is excluded from supply, when the entire consideration is received after obtaining completion certificate, then only it is excluded from supply. Part before, part after, it is covered under supply, and GST is payable on the entire consideration, total consideration on entire amount, and it will be treated as works contract service. So here consideration can be either monetary or non-monetary, and CC refers to completion certificate, F4 refers to first occupation. Usually completion certificate is issued by the competent authority. First occupation means the date on which out of the flats, one flat is registered in one person's name. That is known as first occupation. Date on which flat is occupied by the buyer in the project, it is deemed as completion, and remaining flats unbooked will be excluded from supply. Then distinct persons. Why distinct persons is relevant? We have seen 7(1)(c), related party transaction, including transaction between distinct persons. There are 2 points in distinct persons. Number one registration of a person to another registration is known as a distinct person. Why a person is required to obtain more than one registration? If the person is doing business in multiple states, and if he is liable to get registered, he need to register in every state from where he is making taxable supplies, and that is mandatory. So for example, I am doing business in 4 states, and in 4 states I am making taxable supplies, and I am liable to get registered. Why am I liable to get registered? Because my aggregate turnover exceeds the threshold limit. Now I should register in each and every state. So now 4 states I will get 4 registrations. Now one registration to another registration, if any transaction happens, that's treated as a transaction between distinct persons. Even though without consideration, it will become supply. What if I am doing business within the state, multiple place of business? I have an option either to go for separate registration with respect to each place of business, or I can go for single registration. If I go for separate registration, then one registration to another registration is also treated as distinct person. So you can see in the next page, I have multiple business and I am doing business in different states. Now separate registration with respect to each state is mandatory. I am doing multiple businesses in the same state but in different place of business. Is this separate registration mandatory? No. So optional. Separate registration with respect to each place of business optional. If I am doing multiple businesses, same state and same place, same building, I am doing multiple businesses. In that case, can I go for separate registration? No, I cannot obtain separate registration. Now one registration of a person to another registration of the same person is treated as distinct person. Every registration of a person to the another registration is distinct person. Next point, registered establishment of a person in a state and unregistered establishment of that person in another state is also distinct person. What is this? For example, I am having business in 4 states, say Tamil Nadu, Andhra Pradesh, Karnataka and Kerala. I am having business in 4 states. Now what happens is that in Tamil Nadu, I am making taxable supplies and exempted supplies, taxable supplies and exempted supplies. So in Tamil Nadu, it is 8 lakhs and exempted supplies 2 lakhs, Andhra Pradesh 3 lakhs, 2 lakhs, Karnataka 5 lakhs and 5 lakhs, whereas in Kerala we don't have taxable supplies, we have only exempted supplies 10 lakhs. If you see, my aggregate turnover has exceeded the threshold limit. Say the applicable threshold limit for me is 20 lakhs. So my aggregate turnover exceeds the threshold limit. So what is my aggregate turnover? 8 plus 2, 10, 15. So 20, 25 plus 10, 35. So applicable threshold limit for me is 20 lakhs. Applicable limit is 20 lakhs. And here it crossed 20 lakhs. So I need to register. Where we need to obtain GSTN? We need to obtain GSTN in Tamil Nadu. We need to obtain GSTN in Andhra Pradesh. We need to obtain GSTN in Karnataka. But we don't have to obtain GSTN in Kerala. No need to obtain GSTN in Kerala. Why? Because I am not making taxable supplies. Even then, for Tamil Nadu registration, AP registration and Karnataka registration, Kerala business will be treated as distinct person, even though we don't have a separate registration over there. Between Tamil Nadu to AP or AP to Tamil Nadu to Karnataka, Karnataka to Tamil Nadu, this will be covered in the first point itself, because one registration to another registration, it is distinct person. But one registration, one registered establishment to another establishment in another state, even though not registered, that is also treated as distinct person. Registered establishment of a person in a state and unregistered establishment of that person in another state. So between Karnataka to Kerala, if there is any transaction, that will also come under distinct persons. Okay. So even though there is no GSTN, these are the 2 points that you need to remember. Now, what is the consequences of distinct person? If there is any stock transfers or branch transfers, that will be treated as supply, because stock transfer, branch transfer will happen between head office, branch office, factory, depot, etc. So that will become distinct persons and it will become supply. Then next one, meaning of recipient. So who will be called as recipient? If consideration is involved in the transaction, the person who is liable to pay the consideration is the recipient, not the one who pays the consideration. For example, I got an order from the holding company to provide the services to the subsidiary company. So to me, who is the recipient? Holding company or subsidiary company? Who is required to pay money to me? Who placed the order with me? Holding company. Means privity of contract is between me and the holding company. So holding company is my recipient, even though I provide the goods or services to the subsidiary company. So the one who is liable to pay the consideration is called as the recipient, if consideration is involved. If consideration is not involved, then the one to whom I am delivering the goods or the one to whom I am providing the services will be called as a recipient. So these are the points that we need to know related to supply. Once an activity becomes supply, then, so we have seen 7 subsection 1, 7 subsection 2, the activity became supply. Now we need to check whether the activity is supply of goods or supply of services. How to check that? For that we need to refer to 7 subsection 1A read with schedule 2. So 3 schedules you need to remember in GST related to supply. What are they? Schedule 1. Schedule 1 is related to what? 7.1c. Activities which are treated as supply even though without consideration. Then schedule 2. Schedule 2 is section 7 subsection 1 capital A. Classification of supply into goods or services. Then schedule 3. What is schedule 3? That is section 7 subsection 2. So exclusions from the supply. So remember these 3 schedules. 7.1, that is 7.1c when you are writing, read with schedule 1. 7 subsection 1a read with schedule 2. 7 subsection 2 read with schedule 3. Okay. So we are looking into 7 subsection 1a read with schedule 2. First you need to check movable property. When movable property will become, and remember when activity becomes supply only, you should refer to 7.1a. When activity is not a supply, we don't have to do the classification. So classification comes only when the activity becomes supply. So now there is a movable property. When it will become goods, if there is a transfer of title, it will be called as goods. If there is a transfer of right to use, it will be called as services. I have a car. I am giving you the title of the car, means sale of goods. I am not giving you the title of the car, I am giving you right to use the car, means renting, it will be coming under services. What if the title is transferred at a future date? Example, hire purchase. In case of hire purchase, what will happen? Today we enter into contract. to deliver the product today, but the title will be transferred at a future date, correct, on payment of last installment. But the title is to be transferred at a future date is also treated as supply of goods. So hire purchase transactions are treated as supply of goods only. So transfer of title either at present or at a future is supply of goods. Transfer of right to use movable property is treated as service. Immovable property will never come under goods. So even though there is a transfer of title, it is excluded from supply, na, sale of land, sale of building, etc. So it will not come under goods, but it will come under services. When it will come under services, so if there is a transfer of right to use immovable property, or in case of bringing into existence a immovable property, that is construction activity or transfer of right in relation to immovable property. Then intellectual property rights. Intellectual property rights, example, copyright, trademark, patent, etc. And if it is a permanent transfer, it will come under supply of goods. If it is a temporary transfer of IPR, it will come under supply of services. Example for permanent transfer, patent of a technology sold to a company, permanent transfer, sale of goods. So music director composing music for a movie, it's not permanent transfer, temporary transfer, that will come under supply of services. Then point number 4, carrying out process on the goods belonging to the other person. Now, whether substantial material is given by the supplier or by the recipient, you need to check. For example, I am a tailor and you gave me cloth, I did the stitching. Substantial material who gave? Supplier or recipient? Recipient, which means it will come under supply of services for me because I am just doing the job work. So you gave me the material, I do the process. So it will be covered under supply of services. If I only buy the cloth and I only do the stitching and give it to you, means substantial material is supplied by me. So therefore it will be coming under supply of goods. So if substantial material required for the process is supplied by the supplier, it is supply of goods. If the substantial material required for the process is given by the recipient, then it will be treated as supply of service. Then suppose if it is supply of goods along with services. So means in a transaction there involves both goods and services. Then in that case, 3 notified activities. These 3 notified activities will always be treated as supply of services. What are these 3 notified activities? Works contract, information technology software, and supply of food. These 3 involves both goods and services, but it will always be treated as supply of service. What are those 3 notified activities? Works contract, information technology software, and supply of food. Apart from this, other supplies, any other supply that involves both goods and services, check whether it is composite supply or mixed supply. If it is a composite supply, the principal supply is goods, then entire activity treated as goods. If the principal supply is service, entire activity treated as service. For example, AC and installation is a composite supply. AC is goods, installation is service. So principal supply is AC. So the entire activity will be treated as supply of goods. Then coaching plus study materials is composite supply. Coaching is services, study material is goods. But here what is the principal supply? Coaching. So entirely it will be treated as supply of services. Then suppose if it is a mixed supply, if the highest rate is goods, entirely it will be treated as goods. If the highest rate is service, entirely it will be treated as service. For example, so TV is goods, optional warranty is service. The highest rate is TV, so entirely it will be treated as supply of goods. Then video lectures plus pen drive. Video lectures is service, pen drive is goods. The highest rate is video lectures, so entire activity will be treated as supply of service. So what you need to remember, if it is a composite supply, if the principal supply is goods, entire activity is goods. If the principal supply is service, entire activity is service. If it is a mixed supply, highest rate is goods, entire activity goods, highest rate service, entire activity service. Apart from this, any other activity, that any other activity will always be treated as service. What is that? Doing an act, not doing an act, or tolerating an act. Balancing figure will come under services. Doing an act, so doing some activity. Not doing an act, example, non-compete fees. I am collecting some money for not starting a competing business. So that is supply of service. Tolerating an act, damages. So usually breach of contract, some damages will be collected. So that will come under consideration for tolerating an act, even that is supply of services. Then you can see meaning of works contract and meaning of job work. Basically works contract means what? I told you already, Works contract means it involves both goods element as well as service element, and that should be in relation to what? Immovable property, and there should be a lump sum amount. Then it will be called as a works contract. Works contract will always be treated as supply of service. Then job work, you see. Job work means carrying out process on the goods belonging to the other person is called as job work, okay. But the other person should be a registered person, then only the activity name is job work. If it is not job work, then it will be treated as some other services. For example, I am a supplier and I am doing some process on the goods belonging to you. You have supplied some goods to me. I do the process. Now you are registered. So this activity name is job work. You are not registered. This activity name is services. It will not be called as job work, because what is the main ingredient to be called as job work? The recipient should be registered. In job work, who is the supplier? Who is the recipient? The one who carry out the process is the supplier. The one who supply the goods will be the recipient. So job worker, supplier may or may not be registered, but the principal manufacturer should be registered. Process carried out may or may not be manufactured. Job work is supply of service. Usually in case of job work, the rate is 6% or 12%. And if it is not job work, if the recipient is unregistered, it is not job work but treated as some other service, and the regular rate of GST 18% will be applicable. Then this is about section 7, and in this supply chapter, one more section we have is section 8. Section 8 talks about composite supply and mixed supply. So composite supply, mixed supply, so we have a definition. So first we need to understand the differences between these two. So composite supply means two or more supplies and taxable, two or more taxable supplies of goods or service or both or any combination thereof, which are naturally bundled in the ordinary course of business, one of which is a principal supply. Whereas mixed supply, two or more individual supplies. So in case of composite supply, all the supplies should be taxable. But in case of mixed supply, not necessary that it should be taxable. And in case of composite supply, it should be naturally bundled. But in case of mixed supply, not necessary, because it is not a composite supply. And in case of composite supply, one of which is a principal supply, but that is not relevant in case of mixed supply. So there are three differences between composite supply and mixed supply. First difference, in composite supply, all the supplies involved are taxable, but in mixed, either taxable or exempted or any combination. Second point, principal supply, is it required in case of composite supply? Yes. But in mixed supply, principal supply not required. What is the meaning of principal supply? The predominant supply in the transaction is known as principal supply. That's the main activity, and other activities are called as ancillary activities. Then third point, in case of composite supply, that supply should be naturally bundled in the ordinary course of business. Naturally bundled means what? One cannot be supplied without the another. Then it will be called as naturally bundled in the ordinary course of business. Whereas in case of mixed supply, it is not required that it should be naturally bundled. Now, what should be taken as the rate of GST? If there is supply of goods or services or both, and when there involves more than one supply, and if it is naturally bundled, it is composite supply. In case of composite supply, we will take the rate of principal supply. Suppose if it is not naturally bundled, it is mixed supply, and we will take the GST rate of supply having the highest rate. Suppose if there is no more than one supply, then the question of composite supply or mixed supply does not arise. And here you need to know that there should be a single price in case of mixed supply. If there is no single price, it is not treated as mixed supply, it will be treated as individual supplies and taxable at the respective rate. Okay. So what is that we need to know here is that first you need to check whether there involves more than one supply. So two or more supplies in a transaction. Two or more supplies in a transaction. If the answer is yes, two or more supplies in a transaction, if the answer is yes, then only we will apply section 8. Suppose if it is no, section 8 not applicable, section 8 not applicable, and there involves two or more supplies in a transaction. Now, three conditions you need to satisfy to to become composite supply. What are the three conditions? All supplies are taxable. All supplies are taxable. Then naturally bundled in ordinary course of business. In ordinary course of business. It is naturally bundled in ordinary course of business. Yes. Then principal supply identifiable. Principal supply identifiable. This is also yes. Then what is the name of this? So it is called as composite supply. Don't bother about the price. The price can be separate or the price can be single. Okay. But these three conditions should be satisfied. All the supplies are taxable and naturally bundled in the ordinary course of business, and the principal supply is identifiable. Then it will be called as composite supply. If it is a composite supply, what is the rate of GST that will be applicable? Rate of principal supply. Rate of principal supply applied on entire transaction. Rate of principal supply applied on entire transaction. Okay. Suppose if any one condition is not satisfied, all the supplies are taxable. No. All the supplies taxable but not naturally bundled. All the supplies taxable, naturally bundled, but the principal supply not identifiable. If it is no, then only one condition you need to check, whether it is for a single price or not. Whether it is for a single price or not, you need to check. If it is for a single price, yes, it is for a single price. First, to become mixed supply, it should not be composite supply. First, always apply composite supply in the question. It should not be composite supply and there should be a single price. Then it will be called as mixed supply. If it is mixed supply, what is the rate that you will take? Highest rate. Highest rate applied on entire transaction. Highest rate means in those supplies, what is the highest rate? Applied on entire amount. Suppose if it is no, we don't have, like single price, separate prices we have, then it is neither composite nor mixed. Neither composite nor mixed means what? It will be individual supplies. In case of individual supplies, what we will do? Respective rate for respective supply. Respective rate for respective supply, that will be taken. So this is how we need to arrive at the composite supply or mixed supply or individual supplies. The main challenge that you will have in exam is about naturally bundled or not naturally bundled. Everything else will be given in the question. This is the place where you need to apply your mind and check whether it is naturally bundled or not. How to check that? Little bit of general knowledge is also required in this case, but it will be given in the question itself majority of the cases. Remember, one cannot be supplied without the another. It is called as naturally bundled. In the ordinary course of business, don't see the exceptions. See the most probable side. Example, AC and installation. Usually who sell AC will only do the installation. And so only AC we cannot buy. So because if we buy AC and get it installation, warranty will not be covered. So they will definitely do installation. So it is naturally bundled. Whereas laptop and laptop bag, sometimes laptop will be sold without laptop bag also. But in the ordinary course of business, they will sell laptop along with laptop bag. So most probable side only you see. So it will be again coming under naturally bundled. Don't see it from the recipient point of view, see it from the supplier point of view. Example, inverter and battery. Inverter and battery not naturally bundled. Why not naturally bundled? So inverter will not work without battery, battery will not work without inverter. But that you are seeing from the recipient point of view. See from the supplier point of view. When there is a seller who is selling battery and inverter, can the battery alone be sold without inverter? Yes. Can the inverter be sold without the battery also? Yes. Can it be sold together also? Yes. Therefore, it will not come under naturally bundled. Then So look into 3 notes related to this. Note 1, in case of servicing of cars, composite supply test should not be applied. For cars alone they have given. Usually in servicing of cars, what is the goods element? Parts replaced during servicing is the goods element. And what is the service element there? So labor charges for replacement. Usually it is composite supply. Why? Part taxable, labor charges taxable, all are taxable. Naturally bundle, because service center only will sell the parts and they will only do the replacement. Naturally bundle. Principal supply is parts. If the part is not there, the labor charges for replacement of parts will not come. But don't apply composite supply. You have to treat always as individual supplies only in this case. So the test of composite supply should not be applied. Parts replaced and labor charges for replacement are treated as individual supplies if the amount is shown separately for each. What if it is given together? Then you apply composite supply concept. When it is given separately, so usually bills they will give separately only. They will clearly mention, so parts how much, labor charges for replacement of part how much. So therefore we will treat it like individual supplies only. Then second note related to food and beverages purchased in a theatre, taxable as individual supplies. You go to a theatre, you book the ticket, then in the break interval you go and buy popcorn, coke, etc. and all you purchase. So this food which is sold in the theatre is taxable at what rate? Is taxable at the rate applicable to food, 5%. Supply of food is taxable at 5%, that 5% only will be applied. Okay. If the same is purchased along with the ticket, means what? Combo. So there are some theatres wherein for the ticket itself they will give you the food also as a part of the ticket. Example, PVR director's cut. So one theatre is there in Bengaluru. Ticket price is 1500 rupees. Okay. So 1500 rupees when you pay, and luxury seat and all, amazing environment. Of course, you like to watch everything in Telegram itself. So for you it will not be applicable. So people who have money and can go and spend, so they will go. I didn't go. So I also belong to your category only. In OTT itself I will see. And therefore a lot of people who go there, they will put the post and all. So I went to this movie, etc. So in that I just inquired them, how much is the price? 1500 rupees, and they will get the popcorn and coke as a complimentary along with the ticket. Now in that case, that popcorn and coke is taxable at what rate? The rate applicable to the theatre. So cinema theatre rate is 28%, the 28% will be taken. If the same is purchased along with the ticket, then it may attract composite supply. In such case, food and beverages taxable at the rate applicable to entry to cinema hall. You got it? Suppose, sir, I am booking the ticket in the app, sir, and thereafter I also buy the food and beverages. In that case, will it come under composite supply? No. It will come under individual supplies. Why it will come under individual supplies? You are not paying the single price. For ticket separate, and for whatever you order buy, so that is separate. That is individual supplies taxable at the respective rates only. You got it? Means food and beverages taxable at food and beverages 5%. Cinema theatre rate taxable at 28%. When it will come? Only when it is like a combo. You are buying it as a combo, and then in that case composite supply may get attracted. And what is the principal supply here? Entry to cinema, so that rate will be taken. Then if there are 2 or more supplies which is not a composite supply and also not involving a single price, then these are treated as what? Individual supplies, and it will be taxable accordingly. Got it? So this is about supply, composite and mixed supply. We have some circulars related to this. We'll take a break and thereafter we will continue with this, and few queries are there. So up to some queries we have completed. Then there is one good query. Can I offer 10-1 in one state and 10-2A in another state? No. So I have composition scheme. 10-1 I am going for one state and 10-2A in another state. Not possible. All the states should be 10-1. All the states should be 10-2A. Mix and match is not possible. I should not do that. Then Sir, for warehoused goods, is it processed goods or relinquished goods? Any goods, warehoused goods which is sold. Any warehoused goods which is sold, the money what we receive, that is original importer is receiving money by sale of warehoused goods, is excluded from supply. Then can you give examples where the recipient is exempted from registration? I gave you, that is advocate. Advocate's outward supply, I gave you yesterday only this example. Advocate's outward supply is covered under RCM, either exempted or RCM. As advocate's outward supply is covered under RCM, advocate is exempted from registration. As advocate is exempted from registration, even though they are importing some services on which they need to pay GSTN or RCM, but they are not required to get registered because section 23 overrides section 24, so they are exempted from registration. That's one example. Sir, securities are excluded from goods but why security lending scheme is treated as supply? Because that is not sale of securities, it is lending of securities. Lending of securities will not be coming under sale of securities, it will be coming under facilitating or arranging transaction in securities. Then, sir, in related party definition, why 0.6 is relevant? Because anyway 0.4 explains, yes. 0.4 tells two companies with a common shareholder 25%. But point number 6 is not about investment alone. It can be majority board of directors. Any kind of control is given in point number 6. They are telling two companies having a parent company. The parent company either can control by way of investment or can control by way of majority board of directors or can control by way of operations. So point number 6 is more broader than point number 4. Point number 4 is restricted only for investment, 25%. Okay. Then next. Point 6 explains common control. Yes, I have given. Sir, if another state is having place of business treated as additional place of business like for storage purpose, is it treated as distinct person in another state? Yes. So in another state, if you have a place of business, so even though it is unregistered, that is also your distinct person. You can do anything over there. If it is an unregistered establishment also, it is distinct. What if it is a registered establishment? That is also distinct. How we will consider if supply involves nil rated supply plus 18% supply in the normal course of business, then it will not come under taxable supplies, because nil rated is what? Exempted. One taxable and one nil rated, means it will come under mixed supply only. It will not come under composite supply, because in composite supply all the supplies should be taxable. So one taxable and one exempted will come under mixed supply, and the highest rate should be taken between that, provided there is a single price. What if there is a separate price? For nil rated, no GST, and for 18% taxable, 18% will be taken. Okay, fine. So these are the queries. Okay, so we'll see summary of important circulars, which is in page number 24. These circulars are mainly related to the aspect of supply. So the first circular is with respect to interstate movement of any conveyances, that is between distinct person. So there is a lorry which is taking some goods from one distinct person to another distinct person. On that goods, definitely GST will be payable. But the question is whether GST payable on the lorry. No, GST is not payable on the lorry even though the lorry is goods. So first point you need to remember is that there is a conveyance which is carrying goods or people from one distinct person to another distinct person. GST not payable on that conveyance. Second point, if the conveyance is taken from one distinct person to another distinct person for repairs, whether GST payable on that conveyance if it is taken for repairs? No. So even on repairs also GST, like when the conveyance is taken for repairs also, GST not payable. Say this. It is clarified that such interstate movement of train, buses, trucks, trailers, tankers, etc. carrying goods or passengers or both, or for repairs or maintenance, shall not constitute supply and not chargeable to GST. So this is the first point you need to remember. Then, however, applicable GST as the case may be shall be leviable on repairs and maintenance activity done for such conveyance. So when we are sending the conveyance from one distinct person to another distinct person for repairs, GST not payable on the conveyance, but on the repair activity GST will be payable. For example, there is a factory. So A Limited is having a factory in Tamil Nadu. A Limited factory in Tamil Nadu to A Limited having a depot in Karnataka. So they are sending the lorry containing the goods. So whether GST payable on this lorry which is containing the goods. So goods GST payable, but on lorry GST not payable. So value of goods GST payable, whereas value of lorry there is no GST. Same way, the vehicle is being sent for repair purpose. Say A Limited is having a factory in Tamil Nadu and they have a workshop in Maharashtra. So A Limited is having workshop for repairs in Maharashtra. Now they are sending the lorry. Whether GST payable on the lorry? No, no GST. There is no GST on the lorry. Even after repairs, the lorry will be returned after repairs. So whether GST will be payable on the lorry which is sent after repairs? No, no GST. However, so A Limited workshop is providing the repair services. On that repair services, GST will be payable. Hope you understood this. GST will be payable on the repair activity done by one distinct person to another distinct person. Then one more point. So first point is related to movement of conveyance between distinct person, carrying goods or people, GST not payable. Second point, movement of conveyance between distinct person for repairs, GST not payable. However, on the repair activity, on vehicle no GST, but on the repair service, GST will be applicable. Third point is related to, so movement of goods or tools between the distinct person, not for further supply, but for consumption in the distinct person. Also, the above circular is extended to interstate movement of rigs, tools and spares and all goods on wheels, and except in case where the movement is for further supply. What is that? Usually some spare parts will be sent from one distinct person to another distinct person, not for further supply, but for consumption in the distinct person. On that spare parts also GST not payable. Even though this particular circular is given for interstate movement, the same principle is applicable even in case of intrastate movement. So in the circular they did not specify about intrastate movement, but logically the circular can be applied for intrastate movement as well. Then another point, when an agent will be called as agent acting on behalf of principal. Why? Because principal agent transaction will come under supply 7(1)(c) only if agent is acting on behalf of principal. When agent is called as acting on behalf of principal, in case of sale transaction, invoice is raised by the agent in his name. In case of purchase transaction, the invoice is in agent's name. Then only agent acting on behalf of principal. If agent is acting on behalf of principal, between principal and agent, if there is any activity, that will become supply. Okay. So when an agent is acting on behalf of principal, agent is representing principal on all aspects, and invoice is raised by the agent in his name in case of sale, and the purchase invoice is in the name of the agent. Then next one is related to print activity. In print activity, what is the goods element? Paper and ink is the goods element. Printing and binding is the service element. Now, whether it is supply of goods or supply of services, further they are telling, if printing constitutes principal supply, when printing constitutes principal supply, in case of books, brochures, flyers, etc., the main element is printing. Paper and ink is just ancillary, so therefore it will be treated as supply of service. Whereas paper constitutes the major element, in which case tissue papers or letterheads or envelopes, etc., where the paper is the principal supply and the printing is ancillary, then it will be treated as supply of goods. So in the print activity, two elements are there. So paper and ink is the goods element, printing and binding is the service element. If printing constitutes principal supply, it is supply of service. If paper constitutes principal supply, it is supply of goods. Then next, whether the activity of bus body building is supply of goods or supply of service, again that should be determined based on principal supply. So in bus body building, so they will do fabrication of materials and they will construct one body. So in that, the metal or material used in the structure is called as goods element, and the fabrication, welding and installation is called as a service element. Usually what is the principal supply? Fabrication is only the principal supply, so it will be treated as supply of service. So print activity as well as bus body building, these two cases we need to classify based on principal supply, what constitutes principal supply. then whether the activity of rethreading of tires is supply of goods or supply of services. In rethreading of tires, the old tires is taken from the buyer and the supplier is only doing the rethreading. It is like carrying out process on the goods belonging to other person. It will be coming under supply of service. Suppose if old tire is purchased by the supplier and he supplies the rethreaded tire, then it will be treated as supply of goods. The next, priority sector lending certificates. These certificates are sold by one bank to another bank which has the deficit in meeting the priority sector loan target. Every bank has to spend some money towards the loans for priority sector out of the public deposits. If there is any shortfall, they will buy the priority sector lending certificates from another bank which has given excess loans to the priority sector. So this sale of priority sector lending certificate will be treated as supply of goods, and moreover it will come under RCM. So transaction involving sale of priority sector lending certificate by one bank to another bank will come under RCM. So selling bank will pay GST or buying bank will pay GST. Buying bank will pay GST, that too it is deemed interstate. So always IGST will be applicable because this sale will be happening through e-Kuber portal of RBI. So supplier don't know who is the recipient. So it will be deemed interstate and chargeable to IGST. So in GST there is no exemption to trading in PSLC. Thus they are always taxable as goods, always chargeable to IGST under RCM. As we have list of goods which are covered under RCM, this point you need to keep in mind. So trading in PSLC comes under RCM. Then next, whether the artwork sent by artists to galleries, will it become supply on the date it is sent to the gallery? No. Artist sending the artwork to the gallery will become supply only when art gallery is subsequently selling it to a buyer. If the art gallery is not selling it to the buyer, in the hands of artist it is not a supply and GST not payable. Whether tenancy rights or pagadi system is chargeable to GST. Tenancy right arises in a situation where I transfer the tenancy right to another person. So tenancy right is like a lock-in contract. I will enter into a lock-in contract with the property owner and I get a tenancy right. This tenancy right, I can either transfer it or I can renounce it. For transferring the tenancy right or renouncing the tenancy right, I will get a premium from the another tenant called as tenancy premium. So this tenancy premium is for vacating the property before the end of the tenancy contract. So this tenancy premium, whatever I am receiving as a tenant, will always be taxable in my hands. But the tenancy premium received by the property owner will be taxable if the rent of that property is taxable. If the rent of that property is exempted, the tenancy premium received for that property is also exempted. Then when the rent of the property will be exempted? Generally, rent of property is always taxable. Only in two cases it is exempted. Renting of property is exempted only in two cases. Number one, if it is a residential property given on rent for residential purpose to a unregistered person, it will be exempted. Residential property, residential purpose to an unregistered person is exempted. Residential property, residential purpose to a registered individual for his personal family stay. In these two cases only it will be exempted. Remaining case renting will be taxable. So tenancy premium received by the property owner also will be taxable. In these two cases rent is exempted na. So for that if any tenancy premium is received, that tenancy premium is exempted. So in relation to residential property it will be exempted. In relation to commercial property it will be taxable. In which case? In the case of a property owner. But for a tenant, always tenancy premium will be taxable. So just write down that. So tenancy premium is always taxable in the hands of tenant. In the hands of tenant. Whereas this point is there na in relation to residential property, commercial property. This discussion is only to a property owner. In case of owner, property owner, if it is residential property then it is exempted. Commercial property it will be taxable. But that too residential property when it will be exempted? If it is a residential property for residential purpose to an unregistered person, or residential property for residential purpose to a registered individual for his personal family stay. Anyhow, this discussion again comes in exemption. There I will connect that. Then another point, GST on director's remuneration. Generally, director getting remuneration from the company will be coming under RCM. But in case the director is acting in personal capacity, then whatever money that is received by the director will not come under RCM. So director is only required to pay GST under FCM. So, and one more point related to this is that what if the director is not a employee, then only it will be coming under supply. What if the director is an employee, then it is not a supply, because employee to employer in the course of employment is excluded from supply. How do we know whether a director is employee or not an employee? For that we need to refer contract of service or contract for service. The contract that is entered by the director with the company, if it is contract of service, then the relationship is employer-employee and the activity is not a supply. What if it is contract for service, then it will be supply and GST payable by the company under RCM. Suppose if the contract of or contract for cannot be ascertained, there is another test, that is under Income Tax Act. If the TDS is deducted by the company under 192, then the money received by the director will come under salaries and it is excluded from supply. If the TDS is deducted by the company under 194J, then the money received by the director will be coming under PGBP. So therefore it will be covered under supply and liability to pay GST is on the company under RCM. Say this. Executive director or whole-time director is an employee of the company and TDS is deducted under 192, therefore it will not come under GST, because 192 means salaries na. Then suppose if that part of the director remuneration which is declared separately other than salaries and subject to TDS under 194J, then it will be treated as consideration and taxable under RCM. So who will pay GST? Company will pay GST under RCM. In this regard, one important point you should note is that, so if the director is acting in his personal capacity, if director is providing services in personal capacity, then it is taxable under FCM. This point already come in a different place. I am just connecting it here. Then next one, no claim bonus. So this no claim bonus already we saw in value of supply. Is no claim bonus treated as consideration? Yes, it is a discount, that's okay. But is this no claim bonus treated as a consideration? No. Basically no claim bonus is not a consideration because no one is receiving that. It is just like a deduction from the premium that we need to pay, so that cannot be treated as consideration. Then whether interest received by a del creditor agent is chargeable to GST. So interest is divided into two in GST. Interest on loans, advances, deposits, which is exempted. Interest on account of delay in receipt of consideration, included in the value and chargeable to GST. Now there is a del creditor agent who is getting the interest. Is it taxable or exempted? That depends. Now listen. If there is a del creditor agent who is raising invoice in his name, then del creditor agent is a supplier. So whatever interest that is collected by the del creditor agent, so that interest will be taxable because it is on account of delay in receipt of consideration. If del creditor agent is not raising invoice, the principal is raising invoice, means del creditor agent is a mere agent. So whatever interest that is collected by del creditor agent is for giving finance facility, therefore it is exempted. So you need to divide it into two. For the sale of goods, who raised the invoice? Del creditor agent raised the invoice. Then interest collected by del creditor agent will be taxable. Invoice is raised by the principal, not by the agent. Then in that case, interest collected by del creditor agent will be exempted. If del creditor agent is raising invoice in the name of the principal, so principal is raising invoice, then interest collected by del creditor agent is exempted. If the invoice is raised by the del creditor agent in his name, then whatever interest that is collected by del creditor agent is taxable on account of delay in receipt of consideration. Then next, whether owning controlling interest in the form of shares by a holding company in subsidiary company in supply of services. First of all, transaction in securities is neither goods nor services. One student has asked me, sir, since securities are neither goods nor services, shouldn't we call sale of securities as supply of neither goods nor services? See, that is different. I am telling neither supply of goods nor supply of services. Neither supply of goods nor supply of services, that word we should use when in case of exclusion from supply. For securities, the correct word is neither goods nor services, not supply, neither goods nor services, and consequently it is not a supply. That is the wording you should use. Okay, then, but here it is what holding company is having the shares of the subsidiary company. Holding the shares is not called as a activity, correct? Activity of holding shares of subsidiary company by holding company cannot be treated as supply of service and cannot be taxed under GST. And this circular already we saw whether supply of food and beverages in cinema hall will be taxed under the service of cinema exhibition. Yes, provided it is along with the ticket. Suppose if it is separately, then it will be taxable as restaurant services. Okay. So these are various circulars that we have, and now we are moving on to the next chapter, that is levy and collection under CGST. Then, so there are like 3 queries. How nominee director sitting fees is paid. So any director for that matter, nominee director or independent director or non-executive director, all these directors, whatever money that is received from the company will be coming under RCM, taxable. It is 194J only, it will not come under 192, so therefore it will be taxable under RCM. The company has to pay GST under RCM. But if there is a nominee director who is getting some remuneration from the government, so then it will be coming under excluded from supply. Why excluded from supply? Nominated post. Under the category of nominated post, it will be excluded from supply. Government post, constitutional post, nominated post is there, there it will be coming. Then next, earlier what I meant was if goods are disposed of as free samples but covered under 7(1)(c), then there is no need to reverse ITC. However, if these are capital goods, we have 18 subsection 6. What about other than capital goods? Section 15. So usually capital goods are disposed of, on which ITC avail. We will apply 18(6). What if it is not capital goods? Section 15, normal transaction value we will be taking. What if there is no transaction value? Because it is disposed of without consideration. So when there is no transaction value, we need to determine the value as per rules. Which rule will be applicable? Rule 27 will not be applicable because price is not sole consideration, means there should be consideration but apart from price. And rule 28 not applicable because it's not a related party transaction. Rule 29 also not applicable, but rule 30 will be applicable. What is that rule 30? Cost plus 10%. If that is not there, then residual value will be applicable in that case. Then next, one student has commented yesterday that GSTR 2B is not 13th, it is 14th. Actually, it is 13th midnight it will be generated. Okay. So 14th we will be able to see. 13th morning we cannot see, 13th midnight we can see. So 13th midnight or 14th morning, both are same. Okay. So I didn't tell anything wrong in that. Then next, how nominee director already I said. Then we will move on to segment 3, levy and collection under CGST. So section 9 talks about the levy and collection under CGST. As per section 9 subsection 1, generally liability to pay GST is on the supplier, apart from alcoholic liquor for human consumption. And 9 subsection 2 says in case of 5 petroleum products, right now there is no GST, but as and when GST Council decides, it will come into the ambit of GST. So the general rule is that 9(1) and 9(2) liability to pay GST to government is on the supplier, whereas in case of 9(3), 9(4) and 9(5), supplier will not pay GST to government, but some other person will pay GST to government. In case of 9(3), who will pay GST to government? Recipient will pay GST to government. In case of 9(4), who will pay GST to government? Recipient will pay GST to government. In case of 9(5), e-commerce operator will pay GST to government. When this 9(3) will be applicable, there are some notified goods and notified services. In case of that notified goods and notified services, liability to pay GST is on the recipient. And that list of services and goods both are applicable for exams now. So initially at the time when we have sent this book for print, so they have not given the statutory update, and later on they have given. That's why at the end I have added, so what are the list of goods which are covered under RCM as additional amendments. So we sent the book, they got printed it, and last we have sent this. So it is there in the book, but at the end it is there. Additional amendments This is the list of goods which are covered under RCM. Okay. So therefore, we have both goods as well as services which are covered under RCM, and the goods related notification is what? Notification 4 of 2017. So list of goods, this is applicable for exam. What is the notification? 4 of 2017. List of services which are notified, where is it given? 13 of 2017. So remember, exemptions are given in 12/2017. RCM service is given in 13/2017. RCM goods is notification 4/2017. So only for these notified goods and services RCM 93 will be applicable. Then who will pay GST? We know recipient. Supplier, should the supplier be registered? May or may not be. Supplier may be registered or supplier may not be registered. What about recipient? Whether recipient is compulsorily required to get registered? Yes, subject to exemption. So every recipient who is liable to pay GSTN or RCM is compulsorily required to get registered. Suppose if they are exempted from registration under 23, then they are not required to get registered and pay GST. Who are all exempted from registration? If my outward supply is fully covered under RCM, I am exempted from registration. If my outward supplies are fully exempted, then also I am exempted from registration. If my outward supplies are fully covered under fully non-taxable, then also I am exempted from registration. Or if I am an agriculturist, then I am exempted from registration. So 4 people are exempted from registration. Who are they? Exclusively RCM supplies, exclusively exempted supplies, exclusively non-taxable supplies, and agriculturists. So even though they are having inward supplies on which they need to pay GST under RCM, they are not required to register because section 23 overrides section 24. Otherwise, every recipient who is liable to pay GST under RCM is compulsorily required to get registered. So this is about 9.3. And when 9.4 is applicable, 9.4 is applicable only in case of one transaction, that is inward supplies of a promoter or builder from an unregistered person. So one student asked me, sir, 9.4 is not applicable for exam. No, yaar, 9.4 is applicable for exam because they gave the study guidelines. So for May 24 exam, in this May 24 exam, nowhere it is given that 9 subsection 4 is exclusion. So in the exclusion, they are talking only about ITC for the real estate sector which is excluded. So rate of tax for goods you don't have to remember, rate of tax for services you don't have to learn, exemption for supply of goods you don't have to learn, we will not discuss that. And Kerala flood cess, we have not learned that. I know that it will not be tested in exam. I have not discussed at all in any of my batch, regular batch or exam oriented batch or fast track batch. And manner of determination of ITC in case of real estate transactions, this also I have not discussed with you. So because I know that this was eliminated long back itself, so they will not be testing this for exam. And last, manner of reversal of credit of additional duty of customs in respect of gold door bar. This also I never discussed anywhere in my book also, it is not there. So these things are only excluded, but whatever I have given in the book, that is there in the syllabus, okay. So don't skip anything. 9 subsection 4 is there. 9 subsection 4 is applicable in case of promoter or builder. There is a promoter or builder who is of 9.4, recipient will pay GST. How the supplier should be? Definitely supplier should be an unregistered person, then only 9.4 will be applicable. Then 9.5, when 9.5 will be applicable, there are some notified services supplied through e-commerce operator. Then the liability to pay GST is on e-commerce operator. What are those notified services? HATE. Remember these 4. H for housekeeping services, example urban company, and A for accommodation services, Go Ibibo, Make My Trip, OYO, etc. will be coming, and T for transportation of passengers. Transportation of passengers by any motor vehicle. See, previously it was radio taxi, motor cab, maxi cab, motorcycle. Now any motor vehicle is covered. So, but it should be transportation of passengers. Example, Ola, Rapido, Uber, etc. Then eating food from the restaurant. So, example, Swiggy, Zomato. So, these are the 4 activities which are covered under 9.5, where liability to pay GST is on e-commerce operator. So, tell me what are the 4 activities? H for housekeeping service, A for accommodation service, T for transportation of passengers by any motor vehicle, E for eating food from the restaurant. But in these 4, we have certain conditions. In case of housekeeping service and accommodation service, first 2 cases, the supplier should be unregistered, then only it will be coming under 9.5. What if the supplier is registered? It will not come under 9.5, supplier only will pay GST. See this. In case of H and A, housekeeping service and accommodation service, supplier should be unregistered. What if supplier is registered? It will not come under 9.5, supplier only will pay GST. Whereas the other two is what? T and E. For T and E, transportation of passengers and eating food from the restaurant, whether the supplier is registered or not registered, always e-commerce operator only will pay. There is a restaurant which is selling the food directly to their customers, no GST, because the restaurant is unregistered. Now that unregistered restaurant supply the food through e-commerce operator, so who will pay GST? E-commerce operator will pay GST on this. Even though restaurant is not registered, but if the food is sold through e-commerce operator will pay GST on that. Same is the case. There is a driver who is providing transportation of passengers through Ola or Uber. Now the driver is unregistered. So provided service through e-commerce operator, will there be chargeable to GST? Yes, e-commerce operator will pay GST. Even if the driver is registered or not registered, the position will be same. You got it? Then next, who will pay GST in case of 9.5? E-commerce operator will pay. So these three are the exceptions to the general rule. What is the general rule? Liability to pay GST is on the supplier. But in these cases, so e-commerce operator or recipient will pay GST. Now we are focusing on 9.3, that is list of goods and list of services which are covered under RCM. So we will complete this list of goods. So kindly look into the last page. I have given the list of goods which are covered under RCM. Section 9.3 read with notification number 4/2017. Sir, already in this one what is that? PSLC. Just now we discussed priority sector lending certificate. Who will be paying GST? Recipient will pay GST. So liability to pay GST is on the recipient. Priority sector lending certificate. Okay. And then next you need to know, I think it's not there. It's not there in that book. You quickly make note somewhere, na? Okay. I think I have given that. It might be there. Otherwise, you can make note of it. For the sake of this and all, don't buy new book. Okay. Of course, if you buy it is revenue for me only. But what's the point? Many students ask me, sir, I have November 23 book, sir. Can I make use of it? I told them two options. Number one, if you can afford, you buy the new book. If you cannot afford, anyhow amendments and all I am sharing. In these lectures I am discussing. So just to pause the video and you make note of this amendment. Okay, that's the best thing. Anyhow, it is free only, na? YouTube it is there. How many times you want to pass, you can pass and you can make note of it. Okay. And say this. Or if you want to buy, you buy. Good only. Anything is fine for me. Then, so 9.3 read with notification 4/2017. The first product that you need to remember is what? PSLC. Who will pay GST in this case? The recipient will pay GST. Now see this. 4 goods. 4 goods sold by agriculturist. 4 goods sold by agriculturist. What are those 4 goods? Cashew nuts, BD wrapper. BD wrapper leaves means what? Tendu leaves. So they will take a leaf, put the tobacco on, roll it, na? That is BD leaf. Okay. So this poor man's cigarette, BD leaf. Cashew nuts, BD leaves and tobacco leaves. What is tobacco leaves? This tobacco leaves will be used inside the product. Okay. Outside the product is BD leaf. Inside that we get pieces. Okay. In cigarette inside and all pieces will be there. In cigars inside and all pieces of leaves will be there. That is tobacco leaves. Okay. BD leaves, cashew nuts, tobacco leaves and raw cotton. Not processed cotton, raw cotton. From the plant they take the cotton. So one big kind of will be there, raw cotton. You would have seen one seed will be there. To that seed cotton will be attached. So that they will pluck from that seed. So that is a raw cotton. These 4 are sold by whom? Agriculturists. Then the ability to pay GST is on the recipient. Okay. What is the first point you need to remember? Priority sector lending certificate. Acquiring bank, that is buying bank, will be paying GST. Then second point you need to remember 4 goods. What are the 4 goods? Cashew nuts, BD leaves, tobacco leaves and raw cotton. Okay. sold by agriculturist to any person, liability to pay GST is on the recipient. You understood? And in this case, the recipient should be a registered person. What if they are selling to an unregistered person? As this is covered under 9.3 or not covered under 9.3? Not covered under 9.3, because 9.3 says the recipient should be registered. 9.3 says the recipient should be registered, then only it will come under RCM. So what if it is unregistered person? Means it is not covered under 9.3. When it is not covered under 9.3, then supplier unregistered, recipient also unregistered. Whether any GST is applicable? No, there is no GST. Why supplier is unregistered? Just now I said na yaar, agriculturist is exempted from registration, correct? 4 people are exempted from registration. Who are those 4 exempted from registration? Exclusively exempted, exclusively RCM, exclusively non-taxable, agriculturist. Agriculturist will never register. So supplier is definitely unregistered. And recipient, if registered, it will come under RCM. What if it is unregistered? What if the recipient is unregistered? It will not come under RCM 9.3, which means there is no GST on that, because this point can definitely be tested. They will tell sale of cashew nuts by an agriculturist to an unregistered person. And in the options, liability to pay GST is on supplier, recipient, either on supplier or recipient. D, none of these. The answer is none of this. Okay. Why none of these? Because there is no GST on that transaction. 9.3 will be applicable only if the recipient is registered person. You got it? So what is that you need to remember? First point, priority sector lending certificates. Supplier can be any registered person, recipient is any registered person. Whereas in case of 4 goods, what are the 4 goods? Cashew nuts, tobacco leaves, BD leaves and raw cotton. Supplier should be agriculturist. Who should be the recipient? Any registered person, And then along with this, we will also see, as raw cotton we completed, silk yarn also you see. Silk yarn. Silk yarn is sold by a manufacturer, a person who manufactures the silk yarn from raw silk or silkworm cocoons for supply of silk yarn to a registered person, then it will be coming under RCM. So people who do sericulture, they extract the raw silk from the silkworm cocoons, and even so this raw silk will be supplied to manufacturers. Manufacturers will make the silk fabric, silk yarn, and that silk yarn they will be selling to garment manufacturers. So these people, any person, supplier can be any person, and the recipient should be a registered person, then it will be coming under RCM. See, you have to remember mainly the recipient. Supplier not a problem, recipient only you need to remember. Then only it will come under 9.3. Then next one. So 3 points you understood? Next, say this. Certain essential oils other than those of citrus fruit. There is a big list of essential oils. That list and all we cannot remember. Okay. Less peppermint oil, eucalyptus oil, like that lot of oils they have given. Okay. So remember, essential oils other than those of citrus fruit. Supplier any unregistered person, and recipient should be a registered person. And then we have lottery. Who is selling lottery? State government is selling lottery. State government or union territory. Then only RCM. What if lottery is not sold by state government, is sold by lottery distributor to a lottery retailer? Will it come under RCM? No, it will be FCM. Okay. Then used vehicles, seized vehicles or goods or confiscated goods sold by government. So government is selling seized vehicles or seized goods or confiscated goods. So they will be selling. Excluding Ministry of Railways. Why sir, Ministry of Railways it is excluded? Because write down below in the notes, Ministry of Railways is always covered under FCM. Ministry of Railways is always covered under FCM. We don't have any RCM with respect to this. Ministry of Railways, Ministry of Railways, this is also an amendment. Ministry of Railways always covered under RCM. Sorry. always covered under FCM. So liability to pay GST is on the supplier. That's why they have given excluding Ministry of Railways. Okay. Then state government, union territory or local authority. So supplier is government here. Supplier is government. Government means central government, state government, local authority or union territory. They are selling it to any registered person. So the liability to pay GST is on that registered person under RCM. On what? These seized vehicles or used goods or seized goods or any confiscated goods. Then these are the points that you need to remember, but please remember the supplier and the recipient also, because don't remember only the goods. If you remember only the goods, you may end up with the wrong answer. 90% wrong answer only it will be, because goods you know that it is covered under RCM, but they will not play in the goods, they will play in the supplier and the recipient. So therefore they will be giving like recipient is unregistered person, you will tell RCM, and the recipient is compulsorily required to get registered and all you will write. No, actually it is not there. Okay. One more point also you write down, sale of cashew nuts or sale of tobacco leaves, sale of tobacco leaves by agriculturist to unregistered person. To unregistered person. What is your answer? No GST. There is no GST in this case. Only if it is sold to a registered person it will be coming. Then now one student has messaged, book is not very costly, no point in struggling with the old book and new amendments. That's what I said. But if I tell no, why new book and all, then they will say, see, sir wanted to earn money, he want to construct 4 or 5 buildings, for the sake of that he is telling like that, people will think. It's up to you, you decide which you need. I will not force anyone. Okay. Then say this, one more point, sale of lottery tickets, sale of lottery tickets by lottery distributor to retailer, lottery retailer. FCM or RCM? FCM. Only when the lottery tickets are sold by government to the lottery distributor or agent, then it will be coming under RCM. But when any other person is selling it to lottery retailer or agent, that will not come under RCM, it will be FCM. Okay. Like this, points can be tested. So this is what you need to remember. Okay. So one last time I am repeating. So first you need to know priority sector lending certificates sold by any registered person to any registered person, it will come under RCM. Then second point you need to remember, cashew nuts, BD leaves, tobacco leaves and raw cotton sold by agriculturist to a registered person. Number 3, silk yarn sold by any person manufacturer to a registered person, it will be coming under RCM. And then essential oils other than those of citrus fruit by any unregistered person to a registered person, it will come under RCM. 4 points. Then fifth one is like lottery sold by government to lottery distributor or lottery agent. And the last point you need to know is about that used vehicles, seized or confiscated goods sold by government to a registered person. Correct or not? So now what if, say this, sale of used goods by government in brackets registered to unregistered person. What is your answer? Sale of used goods by government registered to unregistered person. GST applicable. Government is registered, FCM. Between two unregistered persons only no GST. Don't write everything no GST and all. Between two unregistered persons only no GST. Here government is registered to unregistered person. It is not covered under RCM. Why it is not covered under RCM? See the wording there. So sale of used vehicles, seized and confiscated goods and used goods by government to any registered person, then only it will come under 9(3) RCM. Okay. Then, sir, if agriculturist voluntarily taken registration, then agriculturist sold to unregistered person, liable to pay tax under FCM or not? So if they are selling it to unregistered person, it will not come under 9(3). First you should interpret like this. Agriculture is selling to unregistered person. It will not come under 9(3). Not coming under 9(3) means what? Regular FCM. FCM. And is the supplier registered? Yes. Voluntarily he got registered. So let him pay GST. You got it? Suppose if the supplier is not registered, no GST. But if the supplier is registered, GST payable. Same logic, this also. Government selling the used goods to the unregistered person. Is it given in 9(3)? Not given in 9(3). Not given in 9(3) means what? FCM. Got it? FCM. And is the supplier registered? Yes, he will pay. Supplier not registered? No GST. Got it? That is how you need to interpret. Then, what if cashew nuts shelled sold by agriculturist to registered person? So, not shelled, that is processed cashew nuts then, not the raw cashew nuts. Why agriculturist he will be called as? Hypothetical question it is. He will not be called as agriculturist. The moment he do the process, he will not be called as agriculturist, because who is called as an agriculturist? Who is engaged in supply of agricultural produce, produce out of cultivation of land. The moment he does the process, then it will not be called as he will not be called as agriculturist. If he is not called as agriculturist, is he covered under this list? No. So naturally it will be FCM only. You got it? So therefore this question is a hypothetical question here. Now these are the points that can be tested. It's an amendment. Then next we will see services covered under RCM. You understood now? For 2017. Now see the list of services under RCM. Take page number 29. So, the list of services which are covered under RCM is given in notification 13/2017. You need to remember this list with this keyword, Sir CG got salads. So, I have given this in a different manner. So, previously I gave it separately and exemption separately. I have merged these two. So what are the services which are covered under RCM? Parallelly, what are the exemptions related to it? And what are the conditions for RCM? And what are non-applicability of RCM? So like this only you remember in your mind also. First, S refers to security lending as per SEBI by lender of securities to borrower of securities. There is a lender of securities who is lending the securities to the borrower. Why borrower will take securities? Because the borrower might have made a short sales. In order to execute the contract, he need the securities. Short sales means without having shares in his demat account, if he places a sell order, that is known as short sales, and there will be a huge penalty levied on him. Due to that reason, he will borrow the shares and he will make the delivery. Thereafter, he need to replace the borrowed shares, for which he need to also pay a lending fee. On this lending fee, lender will not pay GST, but borrower will pay GST under RCM. And do we have any exemptions? No, we don't have any exemptions. And any conditions for RCM? No. Any non-applicability of RCM? No, means always RCM will be applicable. Okay. Then second point, import of services. Import of services, there are some good number of amendments in this. In case of import of services, we have one exemption. That is import of other than OIDR services by non-taxable recipient is exempted. This was there even before also. Other than OIDR services by non-taxable recipient. But what is the meaning of OIDR services? That got changed. OIDR services means any services which will be provided over internet, full stop. Not necessary that it should be automated. So whether it is automated or not automated, previously only if it is automated it will be called as OIDR. Now whether it is automated or not automated, it will be called as OIDR service. For example, live classes, whether live classes, online live classes requires internet, definitely requires internet. It's a OIDR service even though it is not automated. The one faculty should be there to take the classes, even though not automated. Now it is OIDR services, and OIDR services, they are bringing lot of things into OIDR services like online marketing, digital data storage, like that. But remember one thumb rule, simple: to provide the service, internet is required, then it will be called as a OIDR service. Services whose delivery is mediated by information technology over internet, then it will be called as OIDR services. Okay, and OIDR services imported by any person will be taxable. OIDR service is always taxable, but the exemption is what you read: import of other than OIDR services, that too by whom? Non-taxable recipient is exempted. Who is a non-taxable recipient? Three people: individuals, trust, government. These three people will come under non-taxable recipient. So unregistered individual importing for any personal purpose, or a trust importing for charitable activities, and government for non-business purpose. So these three only called as non-taxable recipient. Let's take one example for each to understand. There is a CA student who is importing, so this Microsoft Office software for installing in his personal laptop. So it will be coming under import of other than OIDR services by unregistered individual. CA student is an unregistered individual. For what purpose? Personal purpose. So this activity will be exempted. So there is no GST on that. Second example, there is a charitable trust. Swami Nityananda Charitable Trust imports video conferencing software to interact with the pilgrims. So it will be coming under what? Import of other than OIDR. Video conferencing software that do not require internet. Okay, software is being imported and it is not OIDR by trust. For what purpose? Charitable activities. Why? Advancement of religion, spirituality and yoga will be treated as charitable activity. Interacting with the pilgrims and touching them will be coming under spiritual activity. So therefore it will be a charitable activity and that import of service will be exempted. Okay, then number 3, that is by government. So example, government is importing some software for the purpose of, like automation of the records. So like this, what is that, registration records or lot of records and all, government will be maintaining na. For automation of that records, they have imported some software. Now in this case, it will be coming under import of software that is other than OIDR services by government. For what purpose? Is it for business or commerce? No, it is other than business or commerce. Again, it will be exempted. Then, do we have any conditions for RCM? No, we don't have any conditions for RCM. Non-applicability of RCM. Sir, in one case, RCM, generally import of service is coming under RCM, but in one case RCM will not come, FCM will come. What is that? Import of what services? OIDR services. By whom? NTOR, non-taxable online recipient. Who is a non-taxable online recipient? Any unregistered person who is importing services for any purpose. Again, amendment is there. Previously, any unregistered person importing for other than business or commerce only, NTOR. But now, who is NTOR, non-taxable online recipient? Any unregistered person. So, any purpose he can import. One more point they added, registered person only for deducting TDS. Then they will come under NTOR. So, who are NTOR? Any unregistered person or registered person who is registered only for deducting TDS. When you will apply NTOR, NTR, NTOR, extra is what? O. O for OIDR. Only when OIDR comes, you will apply NTOR. If OIDR is not coming, NTOR you will not apply. Okay. And in NTOR, importing services, will you come under non-taxable online recipient? Yes. You are a CA student, you will come under non-taxable online recipient because you are an unregistered person. When you import OIDR services, who will pay GST? The supplier located outside India will pay GST. It will not come under RCM. This is non-applicability of RCM. Understood here? So what you should remember first, import of services by any person will come under RCM. Okay, only one exemption we have. What is that one exemption? Import of other than OIDR services by non-taxable recipient is exempted. And in one case, RCM will not come, FCM will come. What is that? Import of OIDR services by non-taxable online recipient. Now, three definitions you need to know. What is the meaning of OIDR? So, any service which is mediated through internet is OIDR. Who is non-taxable recipient? Individual, unregistered, importing for personal purpose, trust. So, whether for charitable activities, government for non-business purpose. Then NTOR, non-taxable online recipient, any unregistered person or registered person only for deducting TDS. Then then R, renting of motor vehicles. So, there is one query here. Sir, whether recorded classes will be classified as OIDR services. So, whether the service is mediated through internet? No, it is not mediated through internet. The moment you download the service, download the content, thereafter internet is not required for watching the lectures. So, due to that reason, it will not coming under OIDR. Means it should be provided over the information technology network through internet. So, means streaming will be there, live streaming. So, the lectures and all will be uploaded in one app, and live streaming, like you can stream and you can watch, okay. But to watch you need the internet, then it will come under OIDR. But usually recorded lectures which will run through one software. So, for downloading the lectures only you need internet, but not for playing. Sometimes you can go to the faculty's place and you can copy the entire content into your laptop also, and you can play the lectures, correct or not, which means that do not require any internet. Once you have activated that, and if without internet also you can watch, correct. For that you should be watching. No, then only it is applicable, okay. But usually by default internet and all will be there, but specifically as I told you that do not require internet, therefore it is not a OIDR service. Then next, renting of motor vehicles. Generally renting of motor vehicles, so we have supplier, owner of the motor vehicle, recipient, the one who takes a motor vehicle on rent, and we have 4 exemptions for renting of motor vehicles. See the first exemption. I have a motor vehicle that can carry more than 12 passengers that I am giving on rent to a state road transport undertaking, okay. So, then it will be exempted. Hiring a motor vehicle greater than 12 passengers. 12 passengers means excluding driver seat or including driver seat? Excluding the driver seat. Passengers to state road transport undertaking. Second point, you see, what is the difference between first point and second point? Second point is electric motor vehicle. First one is motor vehicle. Second one is electric motor vehicle, and first one should be given on rent to state road transport undertaking, and the second one should be given to a local authority. Now you may get a question, sir, I have a electric motor vehicle, sir, more than 12 passengers. I gave it on rent to a state road transport undertaking. Taxable or exempted? I have an electric motor vehicle that I have given on rent to a state road transport undertaking, capacity more than 12 passengers. It is exempted. Correct. This motor vehicle includes electric motor vehicle also. Now, I have a normal motor vehicle which can carry more than 12 passengers. Instead of giving on rent to a state road transport undertaking, I gave it to a local authority. Is it taxable or exempted? Taxable. Okay. So, this somewhere you make note. Renting of electric motor vehicle greater than 12 passengers to state transport undertaking. State transport undertaking. What is it? Exempted. As motor vehicle includes electric motor vehicle. Then next, renting of motor vehicle greater than 12 passengers to local authority. So, this will be taxable as Electric motor vehicle only, electric motor vehicle only exempted. Then next one. Third point, hiring of motor vehicle that can carry goods to a goods transport agency. What is the difference between third point and the first 2 points? First 2 points is about passenger vehicle. This is a goods vehicle and that we are giving on rent to a goods transport agency. Fourth point, hiring of motor vehicle that can carry, like persons, providing transportation services to education institution, providing education up to 12th standard or equivalent. There is an education institution which is providing education up to 12th standard or equivalent, which means a school, and that particular education institution, one person is providing transportation service. Say you are providing transportation service to education institution up to 12th standard. Now I provided renting of bus to you. Now the rental will be exempted. So renting of motor vehicle to a person who is providing transportation service to an education institution up to 12th standard or equivalent. Why equivalent? Because in some places 12th standard will not come under school, it will be coming under colleges, but even that will also be part of this education institution only. So these are the 4 exemptions that we have, and in other cases it will be taxable. Wherever it is taxable, if 3 conditions are satisfied, it will come under RCM. What are the 3 conditions? Supplier should be other than body corporate, recipient should be body corporate, and the rate of GST should be 5%. If all these 3 conditions are satisfied, it will come under RCM. If any one condition not satisfied, supplier should be other than body corporate. What if supplier is body corporate? It will not come under RCM. Supplier should be other than body corporate and recipient should be body corporate. What if recipient is other than body corporate? It will not come under RCM. Supplier is other than body corporate, recipient is body corporate, but the rate of GST is 12%. Then also it will not come under RCM. So rate of GST should be 5%. If any one condition not satisfied, it will not be coming under RCM, it will be FCM. Then another one, renting of residential property. I have a residential property which is given on rent. What are the exemptions in case of residential property? Just now we discussed 2 exemptions are there. Renting of residential property for residential purpose to an unregistered person or to a registered individual for his family stay. For his family stay. For his family stay. Okay. Not for his employee's family stay. You understood? If there is a person, employer taking the house on rent for his employees, okay, he cannot get the exemption. Why he cannot get the exemption? Some other person's family stay he is taking rent. It should be for his family stay. Okay, renting to registered individual for family stay. Here family stay means whose family stay? That person, that individual's family stay. Okay, then next. So in other cases it will be taxable. And any condition for RCM? Yes. What is the condition for RCM? Recipient should be registered. What if recipient is not registered? It will not be coming under RCM. Moreover, it is exempted. That's what we saw now. If recipient is unregistered, it is exempted. Okay. Now in this regard, you should be knowing certain combinations. So see this. Type of property. Type of property, okay, type of property, and purpose, rented to, and what is the taxability? What is the taxability that we need to know? Type of property is commercial property, and purpose, commercial purpose. Rented to registered person. What is the taxability? Is it taxable or exempted? Taxable. Will it come under FCM or RCM? Anywhere we have RCM for this commercial property? No. See, commercial property is not there in the list. Always it is residential property. Look into the table here. Residential property only it is there na. Commercial property not there. Therefore it will be FCM. Then next. Commercial property. For what purpose? Commercial purpose. Commercial purpose. And this is given to a unregistered person. Taxable or exempted? Taxable. But the moment you see unregistered person, you will remember, unregistered person exempted. So you will write it as exempted. No, commercial property will be taxable. So it will be taxable under FCM. And number 3, so that is commercial property. Commercial property for residential purpose. Commercial property for residential purpose. How, sir? Commercial property is given for residential purpose. Hotel is a commercial property. It is given for temporary stay in a residential purpose. So 2 registered person. 2 registered person. Taxable, we don't have any exemption, and again it will come under FCM. Then commercial property. Commercial property for residential purpose. Residential purpose to unregistered person. To unregistered person. Again it will be taxable under FCM. So in this case, this third point case, when the commercial property given for residential purpose, so this residential purpose is basically temporary stay to a registered person. Can the registered person take ITC with respect to it? Generally they can take ITC, we don't have any restriction. But one point you remember, CGST, SGST paid in the other state cannot be taken as ITC. Okay. So for example, I go to Karnataka for one work and I stay in a hotel there. Now that hotel will raise me GST invoice. What GST? CGST, SGST. Why CGST, SGST? The place of supply in case of service in relation to immobile property is location of immobile property. So they will raise CGST, SGST invoice. Now I am in Tamil Nadu, registered in Tamil Nadu. Can I take ITC with respect to that? No, I cannot take ITC with respect to that. Fine. Now as the connection came, I told you this. So commercial property will always be taxable and it will be coming under FCM. Clear? Now we are moving on to residential property. If there is a residential property, that residential property is given on commercial purpose. Is given on commercial purpose to an unregistered, registered person. To a registered person. Is it taxable or exempted? It's a residential property. Carefully interpret and tell. Residential property, commercial purpose to a registered person. Taxable. Okay. Will it come under FCM or RCM? Will it come under FCM or RCM? It will come under FCM. But sir, there is no clarity related to this, sir. Yes, there is no clarity related to this for your exam for the time being, because there is no clarification as to whether it is FCM or RCM, as RCM is not specifically given. RCM is given only for residential property for residential purpose. So this is actually residential property for commercial purpose. Due to that reason, so it will be coming under FCM only. Okay. And if the supplier is registered, he will pay GST. If the supplier is not registered, it will be exempted. Sorry, it will not be no GST. Okay. But we don't have any clarity related to this. However, there are some contrary answers for this. So I have seen, so 2-3 other faculties in this place, they were telling that it will be coming under RCM. This taxable, but this will be coming under RCM. Kindly follow FCM itself, because in the notification 13/2017, nowhere it is clearly mentioned. So due to that reason, when the RCM is not applicable, contrary is what? FCM. That's why you follow FCM only without any confusions. Okay. Then next, suppose if it is a residential property, if it is a residential property for commercial purpose, to a unregistered person, then also it will be taxable under FCM. This place also same. Actually this is no clarity. Due to that reason, we follow FCM for the time being. Maybe in future if the circular comes, it may change. Then residential property for residential purpose to a registered person. What is your answer? Taxable under RCM. It will not be taxable under FCM, it will be taxable under RCM. What if this registered person is registered individual? If this registered person is registered individual, okay, registered person other than individual, so no confusion. Now residential property for residential purpose to a registered individual, okay, registered individual, not for his family stay, then taxable RCM. Suppose if it is residential property for residential purpose to a registered individual for family stay, that person's family stay, then it will be exempted. And last point, 10th point, residential property for residential purpose to an unregistered person, so then it will be exempted. So this can definitely be tested, because again there is an amendment in this place. What is that amendment? Registered individual for his family stay, we have an exclusion, so that is exempted now. So now this you don't have to remember, this is the application, but what you need to remember is what? Commercial property always taxable under FCM. Residential property, two cases exempted. Residential property, residential purpose to an unregistered person. Residential property to registered individual for his family stay is exempted. Remaining cases taxable. And when it will be coming under RCM, if the residential property is given to a registered person, then only it will be coming under RCM. That is with respect to this discussion. Then, so we have seen S, I, R. S for security lending, I for import of services, R for renting of motor vehicles, and another R for renting of residential property. Okay. Then next C for copyright services. So what are the copyrights that we have? So total 4 copyrights are covered under RCM: original literary, dramatic, musical and artistic works. So remember, in case of this original literary, dramatic, musical works and artistic works, basically, so in this original literary, the supplier is author. Dramatic works, so musical works and artistic works, basically they are individuals. Okay. So because copyright will be given only for individuals. So individuals, this is like actually original work copyright. So the music company has got a copyright. So I am the music director. I gave the music copyright to a music company. Now it will come under RCM. Now the music company will give the copyright to any other person. That will come under RCM? No, it will be FCM only. You got it? So only when the individual as a music director or individual as a dramatic work or individual artist, if they are giving it to a supplier as a recipient, then it will come under RCM. Is it clear? So basically these are by individuals. These are by individuals. So because they are having the original work copyright. Okay. Now, is there any exemption with respect to this? No. It will always be covered under RCM. No conditions for RCM also. But in case of original literary, there is one non-applicability of RCM. What is that? If the author opts to pay GST under FCM, then the author only will be paying GST under FCM for the next 1 year from the date of exercising the option. So lock-in period is 1 year from the date of exercising the option. If author opts to pay GST under FCM. Why will author opts to pay GST under FCM? Because if my outward supply is covered under RCM, I cannot take ITC on my inward supply. Due to that reason, I will opt to pay GST under FCM mainly to take the ITC. But if I opt to pay GST under FCM as an author, for the next 1 year, I only should pay. RCM to FCM, no lock-in. Anytime we can shift. But FCM to RCM, there is a lock-in for 1 year. In all other cases, there is no option. Always it will be RCM. Then next one, GTA services. Goods Transport Agency services. So basically, who is a goods transport agency? Any person providing the service by way of transportation of goods by roadways and issues a consignment note by whatever name called is called as a goods transport agency. In case of goods transport agency, there are 3 exemptions. Number 1, if they are transporting notified goods, it is exempted. What are those 6 notified goods? Agricultural produce, then food grains including flour, pulses, then milk and salt. Flour, pulses, milk and salt. Okay. Then organic manure, newspapers and magazines, relief material for natural or man-made disasters, and then defense and military equipment. These are the 6 notified goods transported through GTA. The freight collected will be exempted. Okay. So again, what are the 6 notified goods? Agricultural produce, food grains including flour, pulses, milk and salt, organic manure, newspapers and magazines, relief materials for natural and man-made disasters, defense and military equipment. Then second exemption you see, if the recipient is individual, HUF or artificial juridical person who are unregistered, all 3, individual, HUF and unregistered like AJP unregistered, and they are not having factory, then also services, GTA services provided to them is exempted. Then if the recipient is registered only to deduct TDS, so this is not income tax TDS, everywhere recipient registered only to deduct TDS means under GST section 51, then also it will be exempted. These are the 3 GTA services which are exempted. In remaining cases it will be taxable. Wherever GTA service is taxable, again GTA is having 2 options. Option 1, FCM, they can pay GST under FCM, or option 2, RCM, where the recipient will pay GST. In case of RCM, the rate, here rates you should remember. In case of RCM, the rate will be 5%, and recipient who pay GST under RCM 5%, they can take ITC. For example, I am GTA service provider here. You are my recipient. Now I am not going for FCM option. Then it will be RCM. So you only require to pay GST 5%. Can you take ITC of that 5%? You can take ITC of that 5%, no issue. You are only going to pay and you will only take ITC. But there is FCM option also. So GTA can go for FCM option. Under FCM option, there are 2 rates available to GTA. What are the 2 rates? 12% with ITC and 5% without ITC. Okay. Now GTA can choose either 12% or 5% invoice wise. It is up to them. But this FCM option or RCM option, they need to choose for every financial year. 12%, 5% invoice wise they can choose. But this FCM, RCM option, lock-in period is financial year. If GTA opts to pay GST under FCM, then lock-in period is financial year. Means not like 1 year from the date of exercising the option. Can you tell me what is the difference between this and this? Here it is 1 year from the date of exercising the option. Here it is 1 financial year. Financial year wise they need to choose. And that too, when they need to choose, they need to choose between 1st January to 31st March of the preceding financial year they need to choose, which means it's like this. Say for the financial year 2020, 2023-24. For financial year 2023-24, GTA is under FCM option. GTA is under FCM option. Now for 2024-25, they want to go for RCM. They want to go for RCM. Then when they need to choose, if they want to go for RCM, in this 2023-24 last quarter is there na? 2023-24 Q4. What is it? Q4? Jan to March. In this Jan to March, they need to select the option. Okay. So select RCM option. If they select RCM option, then for the financial year 2024-25, they will be under RCM. Again, 2025-26, they did not select anything in 24-25. So by default, they will be continuing in RCM option. If they have not selected anything, no need to select again. And 2026-27, and they don't want to go for FCM, so they don't have to do any selection. But in 2027-28, they want to go for FCM. So what they should do? Whenever they shift, now you need to take the Q4 of 2026-27, that is Jan to March. In this Jan to March, they need to select FCM option. Okay. Select FCM option. So this is how GTA has to choose. This is the amendment. Previously this point was not there and now they have added. So what is the selection period? Q4. Previous year Q4 is the selection period. Okay. So they have to choose either FCM or RCM, and that will be continuing throughout. Okay. So see this wording. So option to be exercised between 1st Jan to 31st March of the preceding financial year. Okay. And what is the rates applicable to them? So for GTA services, what are the rates applicable to GTA services? Either FCM or RCM. So GTA service divide into two, option 1, option 2. Option 1 is FCM. Option 1 is FCM versus option 2. Option 2 is RCM. And this they need to choose with respect to each financial year, correct? Each financial year they need to choose. Again under FCM, they have two rates. What are the two rates? 12% with ITC versus 5% without ITC. 5% without ITC. Now what about this with respect to each invoice? With respect to each invoice they will choose. And RCM always it will be 5% at the rate of 5%. Now whether 12% or 5%, all these cases recipient can take ITC. Whether supplier is paying 12% or supplier is paying 5% or recipient is paying 5%, recipient can avail ITC. Recipient can avail ITC. Then this with ITC, without ITC is for whom? To the supplier. So supplier cannot take ITC on his inward supplies. Who is the supplier here? GTA service provider. They cannot take ITC on their inward supplies. You understood or not? For example, GTA is purchasing a lorry, and on the lorry can they take ITC? Yes, if their outward supply is taxable at 12%. If their outward supply is taxable at 5%, can they take ITC on the lorry? No. So that with ITC, without ITC is to the supplier, not to the recipient. Recipient can always avail ITC with respect to this. This is what you need to remember for GTA services. Then next. So look into the next one. So far what we have seen is Sir CG, S for security lending, and I for import of services, and R for renting of motor vehicles, another are renting of residential property, C for copyright services, G for GTA services. In this, so we have some exemptions. Conditions so far we have seen in which place, two places only we have seen conditions for RCM. That is, in case of renting of motor vehicles, supplier should be other than body corporate, recipient should be body corporate, rate of GST should be 5%. So if any one condition not satisfied, it will be FCM. Then again, renting of residential property also we saw condition for RCM. What is the condition for RCM? That the recipient should be registered. Okay. So we'll take a break because we have some more points, government services, etc. and all. A small break we will take and then we will continue. Okay. Okay, we'll start. Generally, there is one point like CGST, SGST paid in the other state cannot be taken as ITC. So one student has asked me, where is it specified, in which section, etc. It's not actually specified anywhere in the section. So that is based on CBIC FAQs, and that point is there even in our study material also they have given. So we cannot take ITC with respect to CGST, SGST paid in other state. So believe me, that's correct only. Okay. Then next, G for government services. So we have been seeing list of services which are covered under RCM, in that the government services to business entities. Now if you see here, including services of parliament, state legislature, court or tribunal is now covered under RCM. Previously government service to business entities only covered under RCM, but now that includes even service of parliament, state legislature, that is assembly, then court or tribunal. But generally fees collected by court or tribunal is exempted, no? Fees collected by court or tribunal is exempted. Then how come this point is there? So usually court or tribunal fees will be excluded from supply. It's not exempted, actually it is excluded from supply. But apart from fees collected by court or tribunal in the form of legal fees, apart from legal fees, they will provide some other activities like renting of immobile property, etc. So those activities are covered under supply. So that's what I have given. In case of court or tribunal, it is services other than legal fees. What is other than legal fees? That is renting, etc. Then it will be covered here under taxability. Now, for government services to business entities, we have 14 exemptions, and in these 14 cases, GST not payable. So these are 14 specific exemptions. What are they? Right to Information Act charges, RTI charges. Usually you might be knowing about this a lot. So because you will be applying for your evaluated answer sheets, so that RTI charges which they are collecting, you have to spend money, na? It's not free. Some amount you will pay, 10 rupees or 20 rupees, etc. That amount will be exempted. No need to pay GST on that. Then interdepartmental services provided by one department of central government or state government to another department of central government or state government. For example, Indian Railways providing services to Ministry of Finance, or Ministry of Finance is receiving services from police department. So these are all examples of interdepartmental services which is exempted. Then right to use telecom spectrum. So government is having telecom spectrum, and that telecom spectrum they have allocated to telecom operators, and this allocation was before 1/4/2016. Both one-time charges and annual royalty will be exempted. Suppose if the telecom spectrum is allocated after 1/4/2016, so everything will be taxable. If the allocation is before 1/4/2016, then it will be exempted. Then fourth point, right to use natural resources. What's the difference between third point and fourth point? In the third point it is telecom spectrum. In the fourth point it is natural resources. In the third point both one-time charges and annual royalty is exempted, but in the fourth point only one-time charges is exempted. Then fifth one, right to use natural resources to an individual farmer. So will the individual farmer come under business entity? Yes. So generally business entity means any person engaged in business is known as business entity. Individual farmer will come under vocation. So vocation is also business, therefore individual farmer will come under business entity. So right to use natural resources to individual farmer, it can be assigned any time. Both one-time charges and annual royalty will be exempted. What's the difference between fourth point and fifth point? Fourth point is assignment of natural resources to other persons, whereas fifth point to an individual farmer. Fourth point before 1/4/2016. Fifth point any time. Fourth point, only one-time charges exempted. Fifth point, both one-time charges and annual royalty is exempted. Then sixth one, merchant overtime charges. So generally customs department will be working after office hours and on holidays, for which they will be collecting some merchant overtime charges for doing the clearances. This extra amount which is collected by customs department is exempted. Then safety certificate charges will be collected by the safety officer for giving a safety certificate for the premises where they need to obtain the safety certificate. So this safety certificate charges collected by safety officer is exempted. Then consideration for tolerating an act. When we enter into contract with the government, we breach the contract. When we breach the contract, government will expect us to pay some damages. So this damages which is collected by the government is called as liquidated damages or amount for breach of contract, that will be exempted. That is known as consideration for tolerating an act. Then share of profit petroleum. This share of profit petroleum for assigning right to extract petroleum crude or natural gas is exempted. So in this regard, there is one more point, cost petroleum. Even cost petroleum is also exempted. So now what is this cost petroleum and profit petroleum is all about? So generally government, state government will assign right to extract natural resources, say like any government, it can be state government or central government. So government will assign right to extract petroleum crude or natural gas to leaseholders, and for that the leaseholder is required to pay consideration. That consideration will be annual royalty and share of profit. So government will be giving assignment of right to extract petroleum crude or natural gas. So petrol or natural gas, for which the leaseholder is required to pay a consideration. What is that consideration? Annual royalty. Annual royalty will be payable, plus even share of profit will also be payable. So this is the consideration. Now what will happen? They will form a joint venture. Who will form joint venture? Government and leaseholder will form a joint venture, and in this joint venture, government and leaseholder who forms a joint venture, that joint venture, leaseholder will be the operating member of the joint venture. So they will be generating the petrol or natural resources, that they will be extracting the petroleum crude or natural gas, and they will be getting some revenue from operations. They will get revenue from operations. So this is the joint venture revenue. Now what will happen with respect to this revenue from operations? Here this leaseholder will become operating member of joint venture. Operating member of joint venture. Now let's see what happens to revenue from operations. Revenue from operations, there are two parties. So that is government and leaseholder. Government and leaseholder. First, government will take away the annual royalty, and the leaseholder will take away his expenses. He incurred some expenses for extraction, so that expenses he will recover. That recovery made by the government is known as annual royalty, and that recovery which is made by the leaseholder, recovery of expenses, is known as cost petroleum. Cost petroleum is the name given. This is nothing but recovery of expenses. Recovery of expenses. Now in this case, this recovery of expenses will become supply under section 7(1)AA, whereas this will become supply under section 7(1)A. Why sir it will become supply under 7(1)A? Because before creating a joint venture, they will transfer the right to use natural resources, or they will transfer the right to extract petroleum crude or natural gas. So therefore this particular assignment of right is before creating a joint venture. So due to that reason, at the time when they enter into contract, it was not a joint venture capacity, so that is in the individual capacity only. So therefore it will be supply under 7(1)(a). This annual royalty will be taxable or it will be exempted. This annual royalty is taxable. Why? Assignment of right to use natural resources before 1/4/2016 also only one time charges is exempted, but annual royalty will be always taxable. But this cost petroleum, so there is no GST on this. So no GST is what given in the circular. So we can remember it like, now from the revenue we need to reduce, annual royalty and then cost petroleum. Now the balance that is left is known as profit petroleum, and in this profit petroleum a percentage share will go to government, share of profit, whereas a share of profit will go to leaseholder. That share of profit which goes to the leaseholder is not a supply, because it is like return on investment. So he is investing and he is recovering his investment in the form of profit. So withdrawal of profit is not a supply. Whereas this share of profit received by the government is for the purpose of assigning right to extract petrol or natural gas. So this will be coming under exempted. So you need to remember total 4 points. Point number 1, and any annual royalty which is received by the government from the revenue, that annual royalty will be taxable. Then cost petroleum, recovery of expenses by the leaseholder is exempted. And number 4, share of profit received by the leaseholder is not a supply. And third point is share of profit received by the government will be exempted. So 2 exemptions we have. What are the 2 exemptions? Cost petroleum and share of profit, that is profit petroleum. Then annual royalty will be taxable and the share of profit received by the leaseholder is not a supply. So this is about this point you should remember. See the note. Cost petroleum is recovery of expenses by leaseholder, which is also exempted. Share of profit petroleum. What is this profit petroleum? Revenue from operations minus cost petroleum minus royalty for assigning right to extract petroleum crude or natural gas. Even that is also exempted. Then 10th point, registration charges under any law for the time being in force. So for the purpose of incorporating a company or under any law, some registration charges will be collected, like vehicle registration charges or property registration charges. All those registration charges are exempted. Then fee for birth certificate, death certificate, driving license, visa or passport. Basically these are collected from the individuals, but here service is provided by government to business entity on behalf of their employees. So 5 certificates total: birth certificate, death certificate, driving license, visa or passport. Then 12th point, guarantee commission. Government will guarantee the loans taken by public sector undertakings, for which the public sector undertakings will pay a guarantee commission. That guarantee commission earned by the government is exempted. Then excess royalty collection contractor to the extent of variable royalty. Generally what happens is that whenever government is required to collect the royalty from the leaseholder, they will be appointing one intermediary called as excess royalty collection contractor. Government will give the right to this ERCC, excess royalty collection contractor, to collect the variable royalty against a consideration of fixed royalty. So this is like a swap arrangement. ERCC will pay the fixed royalty to the government and will be recovering the variable royalty from the leaseholder. So in this case, on variable royalty, anyhow the leaseholder will pay GST under RCM. So therefore ERCC is required to pay GST only on the differential amount. For example, if the fixed royalty is 50 lakhs and variable royalty is 40 lakhs, on 40 lakhs anyhow leaseholder will pay. Now what is the extra amount that ERCC is paying? So 10 lakhs. On the 10 lakhs ERCC is required to pay GST. What if the variable royalty is 60 lakhs and the fixed royalty is 50 lakhs? On entire 60 lakhs anyhow leaseholder will pay GST. So ERCC is not required to pay any GST, which means ERCC is exempted to the extent of what royalty? Variable royalty. ERCC is exempted to the extent of variable royalty. Then fee for granting national permit. So generally for goods which are traveling throughout the country, so they will be paying national permit charges. That national permit charges or state permit. Whenever we enter into another state taking a commercial vehicle, we need to take the state permit in that state. That state permit charges, these two permit charges, national permit as well as state permit charges, is exempted. These are the 14 points that we have under specific exemptions. Then there are two general exemptions. Apart from these 14 exemptions, any other activity you need to see whether it is provided to a business entity whose turnover during previous year does not exceed threshold limit. If it is renting of immobile property, this first point general exemption not applicable. So, services other than renting of immobile property to a business entity whose turnover during previous year does not exceed threshold limit, then it is exempted. And second general exemption is if it is any activity apart from 14 activities. See, 14 activities always exempted. Apart from the 14 activities, any other activity provided to business entity where the value of supply does not exceed 5,000 rupees, then it is exempted. Whether this 5,000 rupees point is applicable even in case of renting of immobile property? Yes. But remember, in case of continuous supply of services, what is a continuous supply of service? A service which takes more than 3 months to complete and involves periodic payment obligations. So, this 5,000 rupees should be seen for a financial year. This 5,000 rupees is not per invoice. This 5,000 rupees is for a financial year. Understood or not? Now, so for example, there is an advertising company. That advertising company, they started business during current year. Previous year, the turnover was 0. Now, government is providing the services by way of allowing the advertising company to place the hoardings, for which advertising company has to pay some charges. So, this services provided by government to the advertising company is not in the 14 exemptions, and it is other than immobile property, renting of immobile property. So, the charges collected by the government is exempted. Why it is exempted? Because that advertising company turnover during the previous year does not exceed threshold limit. Due to that reason, it is exempted. Second case, suppose Department of Police is providing security services to one hotel and that hotel turnover during the previous year exceed threshold limit, but the charges paid to police department is only 4,000 rupees. Is it taxable or exempted? It is not covered under the first exemption because the turnover of the hotel during previous year exceed threshold limit, but it will come under the second exemption. Why second exemption? Because the value of supply does not exceed 5,000 rupees. These are the various exemptions with respect to services provided by government to business entity. Is there any conditions for RCM? No, and always it will be coming under RCM. Whereas in one case, two cases, RCM will not be applicable. What are those two cases? One point I told you, Indian Railways will always be coming under FCM. So in case of supply of goods or services by Indian Railways, always it will be FCM. One more case also RCM not applicable, that is renting of immobile property to an unregistered business entity. So there is a unregistered business entity. To that unregistered business entity, government has given immobile property on rent, then government only will pay GST under FCM. Suppose if the business entity is registered, then business entity will pay GST under RCM. So remember, basically all services provided by government to business entity, wherever it is taxable, it will come under RCM. But in two cases, it will be FCM. Number one, renting of immobile property to an unregistered business entity. Number two, services or goods supplied by Indian Railways will also be FCM. Then next, O for overseeing committee. Overseeing committee is providing services to RBI. Overseeing committee services to RBI. Now, in that case, liability to pay GST is on RBI, and we don't have any exemptions, we don't have any conditions for RCM, and we don't have any non-applicability of RCM. Then T refers to TDR, FSI and long-term lease of land. So, transferable development rights. So, whenever government takes over the property of a person, so instead of giving compensation, they will be giving a TDR to that person, transferable development right. What that person can do with the TDR? He can give the TDR to any builder to exceed the FSI of a property. So for that, the builder will be paying some money to this landowner, so who is transferring the TDR. Same way, I have some unutilized FSI that I will be giving to a promoter or builder, for which I will get some consideration, or I have a land which I am giving on long-term lease, for which I am getting some upfront lease amount. So these three amounts, I will not pay GST as a landowner. The promoter or builder will pay GST under RCM. So in which case it will be RCM? Transfer of TDR, FSI and long-term lease of land. So is there any exemption with respect to this? Yes. Proportionate exemption to residential units booked before completion certificate or first occupation, whichever is earlier. How to calculate this exemption? So value of TDR or FSI or long-term lease. Okay, value of TDR, FSI or long-term lease into 18% into what is the exemption? Area of residential units. Area of residential units booked before completion certificate or first occupation, whichever is earlier, divided by total carpet area of project. So this will be the formula for exemption. So first we need to see what is the value of the TDR, FSI and long-term lease, and it will come under RCM. So who will pay GST? Promoter or builder will pay GST under RCM. So on this TDR, FSI long-term lease, what is the rate of GST? 18%. Into to what extent it will be exempted? Area of residential units booked before completion certificate or first occupation, whichever is earlier, divided by total carpet area of the project. Say for example, 20 units are residential units and the 20 units carpet area is somewhere like 10,000 square feet and total carpet area of the project is 30,000 square feet. Then 10,000 divided by 30,000, that is a proportionate exemption which will be available and remaining will be taxable and the promoter or builder will pay GST under RCM. So this transferable development rights, floor space index or long-term lease of land, who transfers it to whom? By landowner to promoter or builder. By landowner to promoter or builder. So the promoter or builder will pay GST under RCM. Then, so we have seen sir, CG, got. Now we are moving on to this salads in that yes, sponsorship services. In case of sponsorship services, who is the supplier? Organizer of the event is a supplier and the recipient will be sponsorer. And is there any exemption for sponsorship? Yes, sponsorship of a recognized sporting event is exempted and any other sponsorship will be taxable. And conditions for RCM, in case of sponsorship, if the recipient is body, corporate or firm, then only it will come under RCM. If the recipient, who is recipient? The one who pay the sponsorship money. If the recipient is other than body, corporate or firm, it will be coming under FCM. See that sponsorship services, exemption, sponsorship of a recognized sporting event, conditions for RCM, recipient should be body, corporate or firm, and non-applicability of RCM, recipient is other than body, corporate or firm. Basically in sponsorship services, who is the recipient here? Who is the supplier and who is the recipient? Because we get confused with respect to that aspect generally. So in case of sponsorship services, supplier is organizer of event. Supplier is organizer of event and recipient is sponsorer. And then we have agent services. In that agent services, the first point is insurance agent. There is an insurance agent who is providing services to the insurance company, and on the commission, what insurance agent will get commission? On the commission, who will pay GST? Insurance company will pay GST. But there is one exemption. If the insurance agent is a business facilitator or a business correspondent working in rural area, the commission earned by this insurance agent will be exempted. So service of business facilitator or correspondent in rural area is exempted. Is there any condition for RCM? No. And non-applicability of RCM? No. Recovery agent. Remember, recovery agent. Here, insurance agent will be providing services to whom? Insurance agent to insurance company. Insurance agent to insurance company. Then recovery agent will be providing services to whom? Recovery agent to banking company. Okay. Recovery agent to banking company. Then only it will be coming under RCM. Is there any exemption? No. And is there any conditions for RCM? No. Non-applicability of RCM? No. Why I told you to banking companies? Basically recovery agents will be for banking company. There is a possibility that there is a trader who appointed a recovery agent to recover the outstanding debts, bad debts and all. Now in that case, this recovery agent services will come under FCM or RCM? FCM only. Only recovery agent who is working for a bank will come under RCM. So all these points, recovery agent, direct selling agent, business facilitator, agent of business correspondent, etc., all these people are in the context of a banking sector. Clear? So it is not related to other sectors. Everything is with respect to banking sector. Banking sector, that includes banking company, financial institution and NBFC. Everyone will be covered in this. Okay. So with respect to banking sector, it will be applicable. So recovery agent to a banking company or a financial institution or a NBFC. Okay. Then direct selling agent. Again, direct selling agent will be providing services to whom? To a banking company. Basically, what is the work of a recovery agent? Recovery agent will do the recovery of outstanding loans, whereas direct selling agent will promote the banking products. Both people will get the commission. But see there, recovery agent always RCM, means bank will pay GST under RCM. But in case of direct selling agent, if the direct selling agent is, other than body corporate or firm, then only it will come under RCM. If the direct selling agent is body corporate or firm, it will come under FCM. Okay. For example, individual direct selling agent gets a commission. Who will pay GST? Bank will pay GST. If it is a firm, direct selling agent in a firm capacity or direct selling agent as a body corporate, if they get the commission, who will pay GST? FCM. The direct selling agent only should pay. Then business facilitator to a banking company. There is a business facilitator who is providing services to a banking company. If the business facilitator is working in rural area, the commission earned by that business facilitator is exempted. Basically, business facilitator will do what activities? Money remittance activities. They will not do anything. So on behalf of the bank, they will do money remittances, for which they will be getting a commission. And if they are working in rural area, it will be exempted. If they are working in urban area, it will be taxable. And who will pay GST in this case? Banking company will pay GST under RCM. And see that services by business facilitator in rural area exempted. We don't have any conditions for RCM, non-applicability of RCM. Whereas agent of business correspondent to business correspondent. Business correspondent is also an agent appointed by the bank to extend its banking operations in the places where there is no branch, and this business correspondent will do all the activities which as a branch manager will do, like account opening, loan processing, check deposit, check collection, etc. So this business correspondent services is not covered under RCM. Agent of business correspondent to business correspondent is only covered under RCM, where liability to pay GST is on business correspondent. But there is one exemption in this regard. If the agent is working in rural area, then that is exempted. And in other case, it will be taxable, and we don't have any conditions for RCM and non-applicability of RCM. Related to this business facilitator and correspondent, so some more detailed analysis is there. You listen. That is, there is a banking company, and that banking company is having rural area branch and urban area branch, and this banking company is having a rural area branch and urban area branch. Now, with respect to its rural area branch, they appointed a business facilitator. And business facilitator, Mr. A is appointed for rural area branch, and Mr. B is appointed for urban area branch. Again, agent of business facilitator means agent of Mr. A and Mr. B. For Mr. A, Mr. X is appointed as agent, and for Mr. B, Mr. Y is appointed as the agent. Now say this. Now, A will provide services to the rural area branch, and for these services, the rural area branch will pay the commission. What is the answer for this commission? Is it taxable or exempted? It is exempted, because business facilitator getting commission from the rural area branch is exempted. Same way, here this agent of business facilitator Mr. X is providing services to Mr. A, for which Mr. A will pay some commission. What is the treatment of this commission? This commission will be exempted or taxable. This is also exempted. As the main agent's commission is exempted, sub-agent's commission is also exempted. So what you need to remember? Business facilitator or agent of business facilitator getting commission from the rural area branch is exempted. Now, Mr. B will be providing services to urban area branch. Mr. B will provide services to urban area branch, for which Mr. B will get some commission from the bank. Whether it will be taxable or it will be exempted. It will be taxable and it will come under RCM. Then who will pay GST on this commission? So the banking company will pay GST under RCM. Whereas Mr. Y provides services to Mr. B, for which Mr. B will pay some commission. So this commission is taxable or exempted. As the main agent's commission is taxable, sub-agent's commission is also taxable, and it will come under FCM or RCM. It will be coming under FCM. So where the liability to pay GST is on Mr. Y, and it will not be coming under RCM. So therefore agent only will pay, which means what is the conclusion we can draw? Business facilitator shall not pay GST on outward supplies and inward supplies. So that is the point you need to remember for business facilitator. Whereas if it is business correspondent, what will happen? So the same story, let's see it from business correspondent point of view. It is making me write again here. 1 second. I'll write again. So banking company, rural area branch, and urban area branch, and Mr. A, Mr. B, and this is business correspondent. Now agent of business correspondent Mr. X and Mr. Y. Now Mr. A provides services in rural area branch and they get a commission. What is the treatment of this commission? This commission will be exempted. Sir, even for business facilitator, same point, yes. Business facilitator as well as business correspondent, everyone it will be same. If they are working in rural area branch, the commission what they are getting will be exempted. Same way, Mr. X will be providing services to Mr. A, and for which Mr. A will pay some commission. What is the treatment of this commission? This commission is also exempted. So business facilitator, what is the first point you need to remember? Business facilitator, agent of business facilitator, business correspondent, agent of business correspondent earning commission from the rural area branch is exempted. Now in case of urban area branch, Mr. A, Mr. B will provide services to urban area branch, and for which this urban area branch will pay some commission. What is the treatment of this commission? This commission will be taxable and it will be coming under FCM or RCM. So we don't have any RCM in this case. So therefore it will be coming under FCM. So therefore liability to pay GST is on the business correspondent. Same way, Mr. Y provides services to Mr. B, for which Mr. B will pay the commission, and this commission will be taxable or exempted. It will be taxable. Why it will be taxable? As the main agent's commission is taxable, this is also taxable, but it will come under RCM. That's the last point. So agent of business correspondent to business correspondent means the GST will be payable by the business correspondent. So 3 points you need to remember. First point, business facilitator, agent of business correspondent, earning money from the rural area branch, exempted. Second point, business facilitator shall never pay GST on their outward supplies and inward supplies. On their outward supplies, bank will pay. On their inward supplies, agent will pay. Whereas business correspondent will always pay GST on their outward supplies, inward supplies. On their outward supplies to bank, they will pay GST. On their inward supplies also, they will only pay GST. That is the discussion related to this business facilitator and correspondent. Then look into the next one. So in that salads, yes, sponsorship services, A for agent services. Who are the 5 agents covered under RCM? Insurance agent to insurance company, recovery agent to bank financial institution NBFC, direct selling agent to bank financial institution NBFC, business facilitator to a banking company. For NBFCs and all, there is no concept of business facilitator, okay, due to that reason. So banking company only. Business facilitator to a banking company, agent of business correspondent to business correspondent. Then L refers to legal services. Legal services provided by individual advocate or firm of advocate, including a senior advocate. So here for individual advocate other than senior advocate and firm of advocates, we have 4 exemptions. First, for advocate services, we have 4 exemptions. What are the 4 exemptions for advocate services? If they are providing services to a person other than business entity, it will be exempted. Who is other than business entity? Individual. So individuals basically who receive the services for their personal purpose will be coming under other than business entity, and that service of advocate will be exempted. Second exemption, you see, if they are providing services to another individual advocate or firm of advocate, it is exempted. And third exemption, if they are providing services to government, so which is central government, state government, local authority, government authority or government entity, not government agency, government authority or government entity, not to the government agency, okay. So services to central government, state government, local authority, government authority or government entity, not to government agency. And one more point is that services provided to a business entity whose turnover during previous year does not exceed threshold limit. These are the 4 exemptions for advocate services, either individual advocate or firm of advocate. I will tell you how to simply remember this, okay. So for individual advocate or firm of advocate, we have 4 exemptions. What are the 4 exemptions? If they are providing services to a person other than business entity, exempted. If they are providing services to central government, state government, local authority, government authority or government entity, exempted. If they are providing services to another individual advocate or firm of advocate, exempted. If they are providing services to a business entity whose turnover during previous year does not exceed threshold limit, exempted. In that, the third point is there no exemption. The third point is not applicable to senior advocate who is providing services. Actually 4 exemptions, but in case of senior advocate, there is only 3 exemptions. That is first point, second point and the fourth point. So this third point is not applicable in case of services provided by a senior advocate. Means if senior advocate is providing service to individual advocate or firm of advocate, what will happen? Then that individual advocate or firm of advocate will in turn have one litigant, applicant or petitioner. That litigant, applicant or petitioner will be taken as the recipient, okay. And if that recipient is other than business entity, exempted. If that recipient is government, exempted. If that recipient is a business entity whose turnover during previous year does not exceed threshold limit, then it will be exempted. In other cases, it will be taxable, okay. So this point is not applicable to senior advocate. So if senior advocate is providing services, then what we need to do? So as this point is not applicable to a senior advocate, if senior advocate is providing services, if senior advocate is providing services to individual advocate or firm of advocate. Individual advocate or firm of advocates, comma, litigant or applicant or petitioner deemed to be recipient. I have not given this point here because it's already covered in the exemptions. It's there in the exemptions. I have just given this as a connecting point here, but it's there in the book, don't worry. So this is about legal services. And any conditions for RCM? No. Any non-applicability of RCM? No. The next one, arbitrator services. Arbitrator services, same, first, second, fourth exemption. What is that first? If arbitrator is providing services to a person other than business entity, exempted. If the arbitrator is providing service to central government, state government, local authority, government authority or government entity, exempted. If the arbitrator is providing services to a business entity whose turnover during previous year does not exceed threshold limit, it is exempted. Sir, what if arbitrator provides service to individual advocate or firm of advocate? Hypothetical, it will not arise because arbitrator is doing out of the court settlement. Advocate is doing so through the court settlement. So through the court he will argue the disputes, so settle the disputes, which means that arbitrator will not provide services to an advocate, advocate will not provide services to an arbitrator. It is hypothetical. If at all service is provided, that will be provided to them in their personal capacity, means it will come under other than business entity, so therefore it will be exempted. Okay, so that is about this arbitrator services. Then look into D. In that salads, S for sponsorship services, A for agent services, L for legal services by individual advocate or firm of advocate. Another A is for arbitrator services. Now D refers to director services to company or body corporate. And in that case, do we have any exemption? We don't have any exemption, but one not a supply point is there. What is that not a supply? If the director is an employee of the company, there is no GST because employee to employer in the course of employment is excluded from supply. If the director is an employee of the company or body corporate, then it is not a supply. And is there any conditions for RCM? No. And is there any non-applicability of RCM? Yes, one case, that's an amendment. What is it I told you? Director is providing services in the personal capacity. Then last, security services, security agency services. There is a security agency which is like a manpower supply agency which supplies the manpower called as security personnel. But not all manpower agencies are covered under RCM. Only security agency providing services to a registered person. Is there any exemption? No, we don't have any exemption. First condition, supplier should be other than body corporate and recipient should be registered. What if supplier is body corporate? It will not come under RCM, FCM. So supplier should be other than body corporate, recipient should be registered but not opting for composition scheme or not registered only to deduct TDS. Suppose if registered, recipient is registered, opting for composition scheme, then also FCM. If recipient is registered only for deducting TDS, then also it will be FCM. In other case only it will be RCM. If any one condition is not satisfied, automatically it will come under FCM. So what are the two conditions? Supplier should be other than body corporate, recipient should be registered but not opting for composition scheme and not registered only to deduct TDS. So this is about Sir CG got salads, list of services which are covered under RCM along with exemptions we have seen. These exemptions point, again it will be coming under exemptions, but we have to learn here itself so that we need to learn it together. Okay, so this way only you remember while you are learning also. Then next one is 9 subsection 4. When 9 subsection 4 is applicable, I told you already, there is a inward supply by a promoter or builder from an unregistered person. So promoter or builder who is making inward supply from unregistered person, we need to check, is it capital goods or is it cement or balance inputs and input services. We need to do the answer if at all we get a question in the same format. First, step number 1, capital goods, whether it is purchased from a registered person or unregistered person. If the capital goods are purchased from a registered person, then no need to pay any GST under RCM, because already we purchased from a registered person, he will be charging GST to us. Whereas if the promoter or builder is purchasing capital goods from an unregistered person, that unregistered person will not be charging GST to promoter or builder. So promoter or builder is required to pay GST under RCM 9 subsection 4. At what rate? At the rate applicable to the capital goods. Then second step, cement. Cement should always be purchased from a registered person, just like capital goods. If cement is purchased from an unregistered person, GST payable under RCM at the rate applicable to cement. What is the rate applicable to cement? 28%. Say this, cement purchased from a registered person, GST not payable under RCM. If cement is purchased from unregistered person, if cement is purchased from registered, GST not payable under RCM. From unregistered person, GST payable under RCM at 28%. Now, you have to see the balance inputs and input services from unregistered person divided by total inputs and input services. So, why balance inputs and input services? Cement already we considered. So, balance inputs and input service from unregistered person divided by total. In the total, cement also we need to take, and there are few things which you should exclude from the balance, total, from the total. What are they? Total 5 things we should exclude. What are they? Electricity. Why? Because electricity is exempted. So therefore, definitely the supplier will be unregistered person. TDR FSI long term lease. Why? Because TDR FSI long term lease is anyhow covered under RCM. So why we need to again bring it under 9 subsection 4. Then petrol, diesel and natural gas. Petrol, diesel and natural gas, non-GST, there is no GST at all. So naturally, we would have purchased it from an unregistered person, so that should be taken out. Okay. So balance inputs and input service from unregistered person divided by total inputs and input service, including cement, excluding TDR, FSI and long-term lease, electricity, petrol, diesel and natural gas. Now you need to check how much is this. If it is less than or equals to 20%, no issue, it is allowed, because we can buy 20% from an unregistered person. So it is allowed. No need to pay GST under RCM. What if it is greater than 20%? We need to pay GST under RCM on the excess over 20%. What is the rate of GST applicable for that? 18% is the rate of GST. So this as it is, you will not be able to understand or get the clarity. We will see with one illustration here. Say you are a promoter or builder and you are making purchases from an unregistered person. Okay. So say this, promoter or builder is having inward supplies during a financial year. Inward supplies during a financial year. In that, from unregistered person and from registered person. From unregistered person and registered person. Capital goods. Capital goods, rate of GST is 18%. Rate of GST is 12%. 12%. From unregistered person, 40 lakhs, and from registered person, 20 lakhs. Then cement. Cement is purchased from unregistered person, 10 lakhs, and what is the rate of GST for cement? 28%, and from registered person, 30 lakhs. Then we have TDR, FSI from unregistered person, and what is the rate of GST for TDR, FSI? 18%, from unregistered person, 5 lakhs, nothing is from registered person. And then other inputs and input services. Other inputs and input services, we have different rates. Some are 5%, some are 12%, some are 18%. And from unregistered person, 20 lakhs, and from registered person, it is 30 lakhs. Okay. Now, this is the story. What is the total? What is the total that you need to do? So in this case, what is the first step? The first step is capital goods. We need to check whether capital goods is purchased from a registered person or unregistered person. Capital goods, how much is purchased from registered person? 20 lakhs. Are we required to pay any GST under RCM? No. So we need to. So the question here is compute GST payable under RCM under section 9 subsection 4. So capital goods purchased from an unregistered person. So on that only we need to pay GST. What is the value of the capital goods purchased from unregistered person? 40 lakhs. 40 lakhs into 12%. That will be 4,80,000. Then second step, cement. Cement is purchased from unregistered person. Registered person, no issue. For an unregistered person, how much is cement purchased from unregistered person? 10 lakhs. 10 lakhs into 28%. That will be 2,80,000. And then we need to take TDR or FSI. TDR, FSI should be ignored, correct? Other inputs and input services from unregistered person. Other inputs and input services from unregistered person divided by total inputs and input services into 100. Total inputs and input services into 100. So what will be taken in the numerator? Other inputs and input service from unregistered person 20 lakhs divided by total. What will be taken in the total? 10, 30, 20, 30. Don't take 5. TDR, FSI will not come. Capital goods also will not come in the denominator. So but cement will come. So 30 plus 10, 40, and 30 plus 10, so that is 50. So therefore 90 lakhs. So 20 lakhs divided by 90 lakhs into 100. How much is the percentage? 22.22, which is greater than 20%. So we need to pay some GST under RCM. What is the GST that we need to pay under RCM in this case? So in this 90 lakhs, what is the excess amount beyond 20%? 2.22. Exactly 22 or 22222? Okay. So then you do that in calculator. 90 lakhs into 2.222222 percentage into what is the rate of GST? 18%. Even though some of the goods are 5%, 12%, 18%, but we need to take always 18% only. So what is that 18%? 90 lakhs into 2.22% into 18%. That is 36,000. 36,000 will be taken as a GST payable. So therefore, what is the total GST payable under 9 subsection 4? So total GST under section 9(4) is 4,80,000 plus 2,80,000 plus 36,000. 7,96,000. So this is how you need to arrive at the answer. Step number 1. What we did for step number 1? Capital goods purchased from registered person. We are not required to pay. Excuse me. So we are not required to pay any GST under RCM. But capital goods are purchased from unregistered person. We need to pay GST under RCM at the applicable rates of GST. So that's what we did for capital goods. Purchased from registered person, we have not paid any GST. Purchased from unregistered person, we need to pay GST at the rate of 12%. That came to 4,80,000. Then cement. Cement purchased from registered person, GST not payable under RCM. Unregistered person, GST payable under RCM at 28%. So cement purchased from unregistered person, 30 lakhs. We are not required to pay GST, but on this 10 lakhs we need to pay 28%. That's why 2,80,000 we got. Then balance inputs and input service from unregistered person divided by total inputs and input services including cement but excluding TDR, FSI. So accordingly we have taken total. In the total 10, 30, 20, 30, 90 will come, and balance inputs from unregistered person is 20. So 20 by 90, 22.22. Is it less than 20% or more than 20%? If it is less than or equals to 20%, GST not payable under RCM because 20% is allowed. If it is greater than 20% on the excess amount, GST payable under RCM on the excess over 20%. What is the excess over 20%? 2.22. So total 90 lakhs into 2.22%. into 18%, that is 36,000. So 4,80,000 plus 2,80,000 plus 36,000, 7,96,000 will be GST payable under 9 subsection 4. So there are two questions here. Sir, will the GST paid under 9.4 will be CGST and SGST? Possible. If it is intrastate purchases, CGST and SGST will be possible. Whether 9 subsection 4 is applicable for government entities, to everyone it will be applicable, we don't have any relaxation. Provided that government entity is a, or the public sector undertaking is a promoter or builder, they should be engaged in construction. For them also it will be applicable. This is common for everyone, we don't have any relaxation. This is about 9 subsection 4. Then 9 subsection 5 you see, liability to pay GST on e-commerce operator in case of notified services. So what are the four notified services? Housekeeping services, accommodation services, transportation of passengers, and E for eating food from the restaurant. Now in this case, how the supplier should be? For housekeeping services, supplier should be unregistered. Accommodation service also, supplier should be unregistered. In case of transportation of passengers, okay, supplier can be registered or unregistered. In case of eating food from the restaurant, supplier can be registered or unregistered. Now there is non-applicability of 9.5. This is very, very important, you should remember. When 9.5 is not applicable, listen. When for housekeeping service 9.5 not applicable, if the supplier is registered. And when in case of accommodation service 9.5 not applicable, again if the supplier is registered. And in case of transportation, there is an amendment. When 9.5 is not applicable, if it is omnibus, transportation of passengers through omnibus by a company, there is a company which is transporting the passengers through omnibus. What is a omnibus? So a vehicle which is having a capacity of greater than 6 passengers is called as a omnibus. You can see there. So other than omnibus, capacity greater than 6 passengers by a company. Mainly why they brought it? Because there are lot of travel agencies which are operating their businesses as a company and which will be providing transportation of passengers through bus. Okay, lot of travels are there na, Parveen Travels and then many travels. So Orange Travels like that is there, TAT Travels like that and all is there. Once you go to this bus station, you will be seeing, if you want to go to any place in south like Madurai or Tiruchi etc. and all, lot of private bus operators you will be seeing. So these private bus operators mostly will be registered as a company. They will be incorporated as a company. So they don't want in this case e-commerce operator to pay GST. That's why it has been excluded from 9 subsection 5. So in case of transportation of passengers through e-commerce operator, whether the supplier is registered or unregistered, 9.5 will be applicable. Only one exception. What is that one exception? If it is omnibus by a company. What if it is transportation of passengers through omnibus by a firm? By a firm, it will still come under 9.5. 9.5. If it is only by a company, it will be coming under exception to 9.5. Exception to 9.5 means who will pay GST? Supplier shall pay GST. Then eating food from the restaurant. Generally in case of eating food from the restaurant, so whether the supplier is registered or unregistered, it will come under 9.5. But here also one exception is there. What is that exception? If there is a restaurant in a hotel, that hotel is having a declared tariff per day, per room greater than 7,500 rupees. So means it's like a 4-star or a 5-star hotel. Per day charges is greater than 7,500. Any one room. And in that hotel, there is a restaurant. That restaurant is selling food through Swiggy or Zomato. Who will pay GST? The restaurant only will pay. E-commerce operator will not pay. So if the restaurant is in the specified premises, that is in a hotel having declared tariff greater than 7,500 per day, so then 9.5 will not be applicable. Supplier shall pay GST. So this is very, very important, and this can be tested for the exam, because 9.5 you already know what are the list of services which will come under 9.5, but what they will test is non-applicability of 9.5 they will be testing. Okay. Then see this, some important points in this regard. So there is one query, sir, but in case of petrol, diesel and natural gas are non-taxable, but in 9.5 it is included in the balance inputs. Okay. So read there here, properly read here, don't ask me here, had it been class na, some other word would have come out of my mouth. Clearly I have given here, including cement, excluding TDR, excluding here, see here, properly you see here, excluding TDR, FSI, long term lease, it's not including, okay. So all these are excluded, only cement will be included, okay. Next, that's why sometimes I should not see the query. Yes sir. Yes. It's already there under RCM, that's why 9.4 it will not come, because it is already covered under 9.3. So that's why we will not be bringing it here. Sir, if a bus has greater than 6 passengers, it will be treated as omnibus. Yes, it will be treated as omnibus only. That's what I said. Capacity greater than 6 is omnibus. So if you ask me the same question, I don't know what to reply. So capacity more than 6 passengers is omnibus only. In case of omnibus, by company 9.5 will not come, by any other person 9.5 will come. Then see these important points. First one, whenever e-commerce operator is liable to pay GST on the above services, they are not required to deduct TCS. There is a concept of TCS under section 52. Remember, TCS under section 52 and 9 subsection 5 are mutually exclusive. Wherever 9.5 comes, TCS will not be applicable. Wherever 9.5 is not coming, TCS will be applicable. Where sir 9.5 not applicable? Many cases. Supply of goods through e-commerce operator, 9.5 will not come. Supply of other than these 4 notified services through e-commerce operator, 9.5 will not come. These 4 notified service also we have exceptions wherein 9.5 will not come. In that case, TCS will be applicable. E-commerce operator is required to pay TCS, remit the money to the supplier after reducing the TCS. Okay. So when e-commerce operator is liable to pay GST on above services, they are not required to deduct TCS. So remember, section 9 subsection 5 and section 52 are mutually exclusive. Then only in case of notified services, e-commerce operator is liable to pay GST. In other cases, who will pay GST? Supplier will pay. For example, Amazon or this Flipkart, Meesho, etc. Supplier of goods through e-commerce operator, who will pay GST? Supplier only will pay. E-commerce operator will not pay GST on the goods. Then e-commerce operator will pay GST on what? Commission. If supplier pays GST on the transaction, e-commerce operator will pay GST on what? Commission. Then every e-commerce operator who is liable to pay GST or who is liable to deduct TCS is compulsorily required to get registered irrespective of their threshold limit. Which e-commerce operators? 2 e-commerce operators are compulsorily required to get registered. One e-commerce operator who is liable to pay GST under 9.5. Another e-commerce operator who is required to deduct TCS. Literally, whenever 9.5 not applicable, TCS will come, which means naturally every e-commerce operator is compulsorily required to get registered. Also, every supplier of goods through e-commerce operator is compulsorily required to get registered under GST, irrespective of their aggregate turnover. However, here also there is one amendment. Sir, previously, supplier of goods through e-commerce operator is compulsorily required to get registered. But now they brought in one amendment which says that if he is making only intra-state supplies, that supplier of goods through e-commerce operator, then he is not required to register compulsorily. He can register only when he cross threshold limit. Until that point of time, he will be obtaining a unique enrollment number, and using that unique enrollment number, he will list his goods with the e-commerce operator, which means can he make interstate supplies? No. So just like that composition scheme, supplier of goods through e-commerce operator can opt for composition scheme, but they should not make interstate supplies. Same way, supplier of goods, if that supplier is making only intra-state supplies, then they should register as and when aggregate turnover exceed threshold limit for registration. What about service provider? Supply of notified service or supplier of other than notified service through e-commerce operator is required to get registered only when their aggregate turnover exceeds threshold limit. So, therefore, this fourth point is important that can be tested, wherein if there is any supplier of goods through e-commerce operator, if they are making only intra-state supplies, they are not compulsorily required to get registered. They need to register only when aggregate turnover exceeds threshold limit. So, these are the points we need to remember. In this regard, there may be a confusion related to who will pay GST on what amount. Okay. So, now we can categorize this into two aspects. Okay. 9.5 is applicable, 9.5 is not applicable. You understood? Supply is through e-commerce operator. Say this. Supply of goods or services through ECO. Supply of goods or services through e-commerce operator. We will divide into two. 9.5 applicable, 9.5 not applicable. Section 9.5 applicable. You know now when section 9.5 is applicable and section 9.5 not applicable. Wherever section 9.5 is applicable, on the transaction who will pay GST? GST on transaction. Who will pay? E-commerce operator shall pay. Whereas if 9.5 is not applicable, supplier shall pay. Got it? ECO shall pay GST to government. On what? On the transaction. Whereas here, supplier shall pay GST to government. Now, what is the liability on other person? What is the liability on the other person? Liability on other person. So, e-commerce operator shall pay GST na here, correct, on the transaction. Now, who is the other person? Supplier. What will be the liability on the supplier? There is no liability on that supplier. Why there is no liability on the supplier? Because on the transaction e-commerce operator will pay, but the supplier will receive some share na on that. Whether supplier is required to pay any GST? No. Then supplier will just to show it as non-GST outward supplies in the return, but they will not pay any GST on the share. Okay. So, liability on other person not applicable. Amount collected by supplier, amount collected by supplier shown as non-GST supplies. Non-GST supplies. Then here, what about the liability on other person? The liability on other person, who is the other person? E-commerce operator. E-commerce operator shall pay GST on what? Shall pay GST on commission and raise invoice to supplier. And raise invoice to supplier. Okay, which can be availed as ITC, which can be availed as ITC by supplier. Simple here. This is what you need to remember. Supply of goods or services through e-commerce operator, wherever section 9.5 is applicable. On that transaction, who will pay GST? E-commerce operator shall pay GST. Now, as a supplier, I will be getting some share. So, for example, you take accommodation services through e-commerce operator, Go IBB or Make My Trip or OU. OYO will pay GST on the transaction. Whatever money they collect from the guest, they will pay GST. Now they will give me some share. Say for example, 75-25 is the ratio. They will pay GST on full amount. Then they will remit 75% to me. On that money which is remitted to me, should I pay any GST? No, not required. And I will just account it in my books as non-GST supplies. There won't be any GST. Just for accounting purpose, I will account it as non-GST supplies. Is it clear? Whereas section 9(5) not applicable. So for example, if I am selling goods through Amazon or Flipkart, I will pay GST on the transaction. Whereas that Amazon or Flipkart will get a commission. On that commission, they will pay GST and they will raise invoice to me, and I can take ITC with respect to that. Okay, that is with respect to supply of goods or services through e-commerce operator. And we completed segment 3, that is RCM and its related exemptions. Look into segment 4, levy and collection under IGST. So there are a few sections of IGST that we need to know. First, section 7 and section 8. Section 7 talks about interstate supply. Section 8 of IGST talks about intrastate supply. What is the meaning of interstate supply? If location of supplier and place of supply is in 2 different states or 2 different union territories or a state and a union territory, then it will be interstate supply. And import of goods and import of services are always deemed as interstate. Apart from that, there are few more deemed interstate also. That is, if location of supplier in India and place of supply outside India, then also it will be deemed interstate, where the supplier should be India and the recipient should be outside India, then also it will be deemed interstate. Then supply to SEZ or supply by SEZ, that is also deemed interstate. Then 7(5)(c). 7(5)(c) says supply in India and not elsewhere covered. In the 2 points are there. Number 1, supply beyond territorial waters and up to 200 nautical miles from the baseline. So that is also deemed interstate. And place of supply is determined under section 13, and that place of supply is in India, then also it will be deemed interstate. Okay. For example, say this. So what happens is that generally the place of supply in case of service in relation to immovable property is location of immovable property. So there is a supplier who is an architect. There is an architect, and this architect is located in Mumbai, Maharashtra, and this architect is providing services to Elon Musk. Mr. Elon Musk, so who is a person located in US, and to this Elon Musk, this architect is providing services in relation to a property. Where is that property located? That property is located in Mumbai, Maharashtra. Now, in this case, we need to determine the place of supply under 12 or 13. So place of supply will be determined under section 13. Why place of supply will be determined under section 13? If any one person in India and the other person is outside India, the place of supply is determined under section 13. And that place of supply will be location of property. So what is the location of property? The location of property is Mumbai, Maharashtra. That will be taken. What is the location of supplier? Location of supplier also Maharashtra. When location of supplier is Maharashtra, place of supply also Maharashtra, logically we will think that it is an intrastate supply. No, as the place of supply is determined under section 13, it will be deemed interstate, means it will not become intrastate, it will be deemed interstate, and section like IGST will be applicable. Okay, so once the place of supply is determined under section 13, and if the place of supply is in India, don't apply intrastate, it will always be deemed interstate. That is about this. Then next, suppose if the supply takes place in the territorial waters, what will happen? So this is the baseline of India, and from the baseline of India up to 12 nautical miles will be called as territorial waters. Up to 12 nautical miles is known as territorial waters. Territorial waters. And beyond 12 nautical miles, and up to 200 nautical miles is known as exclusive economic zone. Exclusive economic zone, and beyond 200 nautical miles is known as high seas. And India extends up to 200 nautical miles from the baseline. So up to 200 nautical miles is called as India. Now there is a supplier who is located in India, and the place of supply is in territorial waters. Supplier in India, place of supply is in territorial waters. It will be either intra or inter, depends. What is that? We need to see the nearest coastal state or union territory. If the nearest coastal state or union territory is the same state of supplier, it will become intra. If the nearest coastal state is some other state, then it will become inter. For example, supplier is located in Tamil Nadu, and he is providing repair services to a ship which is in territorial waters, and the place of supply is location where services are actually performed. If the ship is nearest to Tamil Nadu, then that is coastal state, Tamil Nadu, then it will be taken as intrastate supply. If the ship is near to Andhra Pradesh, then it will be taken as interstate supply. Like that we need to determine in terms of section 9. Suppose if location of supplier is in India and the place of supply is in exclusive economic zone, always it will be deemed inter. That's another point. As India extends up to 200 nautical miles, if the supply is beyond territorial waters and up to 200 nautical miles, it will be called as deemed inter. Suppose if the supply takes place in high seas, so place of supply is in high seas, then also it will be called as deemed inter. Why it will be called as deemed inter? Location of supplier in India, place of supply outside India, because it is outside India, na? This will be called as outside India. So therefore, then also it will become deemed inter. This is as per section 7.5a, and this will be because of section 7.5c. Okay, but both will be called as deemed inter. So that is what you need to remember. So tell me out of this, what are the activities which are treated as deemed interstate? Number 1, import of goods or import of services. Number 2, location of supplier in India, place of supply outside India. Number 3, supply to SEZ or supply by SEZ. And number 4, so supply beyond territorial waters and up to 200 nautical miles from the baseline. And number 5, supply, place of supply is determined under section 13 and it is in India. That's a deemed interstate. Now one more point also. Export of goods. Export of goods means what? Taking goods from India to a place outside India is known as export of goods. In case of export of goods, where is the location of supplier? India. What is the place of supply? The place of supply for export of goods is location outside India. As supplier in India, place of supply outside India, export of goods will come under deemed interstate. So as location of supplier in India, place of supply outside India, consequently export of goods will come under deemed interstate. Also, what is the meaning of export of services? 5 conditions should be satisfied for export of services. Supplier should be in India, recipient should be outside India, and place of supply should be outside India. Consideration should be in convertible foreign exchange, and wherever permitted by RBI, it can be in Indian rupees. Supplier and recipient are not two establishments of the same person. In that, if you see, for export of service, where the supplier should be India, where the place of supply should be outside India, then export of service also will come under deemed interstate. So you need to add one more point into the list of deemed interstate supplies. What is that? Export of goods and export of service. So import of goods, import of services, export of goods, export of services, place of location of supplier in India, place of supply outside India, supply to SEZ or supply by SEZ, then supply beyond territorial waters and up to 200 nautical miles, place of supply determined under section 13 and that is in India. One more point which we learnt long back, priority sector lending certificate. Trading in PSLC will be through e-Kuber portal, and the supplier don't know who is the recipient and the recipient don't know who is the supplier. Due to that reason, it will be treated as deemed interstate supply. Then security lending under SEBI. So in case of security lending, RCM will be coming na. The lender of the securities don't know who is the borrower because this will happen through stock exchange. The borrower don't know who is the lender. So therefore, the security lending also treated as deemed interstate supply. Then one more point we have with respect to deemed interstate based on section 8. So please see section 8. Section 8 talks about the meaning of intrastate supplies. So what is the meaning of intrastate supplies? If the location of supplier and place of supply is in the same state or same union territory, then it is intrastate. And there are few activities which are treated as deemed interstate as per section 8. Supply of goods or services to or by SEZ. Already we know that. Import of goods, already we know that. Extra we have is supply of goods to a tourist. This is the 9th point. Supply of goods to a tourist will be coming under deemed interstate. So there is a tourist who is coming from outside India to India, and his stay in India is for a period not more than 6 months, and he will be procuring some goods in India. So for that, we need to charge only IGST, even though he is located in the same state and we are also located in the same state. Supply of goods to a tourist is deemed interstate. They created this provision because in section 15 they brought in one tourist refund scheme. For the sake of that they created, but the tourist refund scheme is not applicable at present, but this point of deemed interstate alone will be applicable. Okay. Then apart from these 9 points, any advance which is collected, and at the time of collection of advance we don't know whether it is intrastate or interstate, then also it should be deemed as interstate. So this is about deemed interstate supplies. Total 10 points. You can see next page. Very important, because in case of this 10 points always it should be IGST, and you should not put it under CGST, SGST, you need to put it under IGST. So what are the 10 deemed interstate supplies? Supply to or by SEZ. Import of goods or import of services, export of goods or export of services, location of supplier in India, place of supply outside India, supply of goods to a tourist, and supply of goods or service beyond territorial waters and up to exclusive economic zone, location of supplier in India and place of supply in India as per section 13, security lending under SEBI, trading in priority sector lending certificates, then advances received which cannot be categorized into intra or inter. These are the 10 deemed interstate supplies. Got it? Then next, supplies in territorial waters. What will be taken as supply in territorial waters? The location of supplier or the place of supply will be the nearest coastal state or the union territory that will be taken. That's the example I have given. If a marine engineer is registered in Tamil Nadu, provides repair services to Mr. Musk, located outside India, for his ship located in territorial waters of India, and place of supply will be location where services are actually performed. Sir, but in case of repairs to ship, we have an exception, sir. We need to take location of recipient. That is when. So repairs, overall, and maintenance in relation to ship or vessels and its parts. If it is for business purpose, then only that exception will come. Location of recipient will be taken. Otherwise, it is location where services are actually performed. So don't look at me like this. So this is one provision which is there, and here it is location where services are actually performed. That is location of the ship. But as the ship is in territorial waters, place of supply shall be the nearest coastal state where the ship is located. And if the nearest coastal state is Andhra Pradesh, where this marine engineer is located, Tamil Nadu, nearest coastal state Andhra Pradesh means it will be inter. What if the nearest coastal state is Tamil Nadu? Then it will be coming under intrastate supplies. Then look into previous page. We have the meaning of export of goods and export of services. What is the meaning of export of goods? Taking goods from India to a place outside India is known as export of goods. Is consideration essential to be calling it as export of goods? No. Consideration is not essential to call the transaction as export of goods. However, if you are not able to realize the foreign exchange proceeds within the time limit under FEMA, you will not be able to enjoy any benefit. Even if you have already claimed any refund, that refund will become payable. Say this. Taking goods from India to a place outside India is export of goods. consideration in foreign exchange is not a condition. However, if foreign exchange not realized within the time limit under FEMA, what is the time limit under FEMA? 9 months from the date of export. Then already we would have claimed refund at the time of export of goods. That refund, whatever we have claimed, will be recovered from us. So shall be recovered. Then what is the meaning of export of services? In the meaning of export of service itself, they are telling that consideration should be in foreign exchange. That's why in case of export of goods, very, very important point, concentrate. In case of export of goods, we will claim the refund immediately upon export. And if you are not realizing the proceeds, that refund will become recoverable. But in case of export of services, we will claim refund only when we realize the consideration in foreign exchange. Otherwise, we cannot. That's the reason why for export of goods, realization certificate or foreign inward remittance certificate is not a supporting document. But for export of services, bank realization certificate or foreign inward remittance certificate is one of the supporting document. Means in case of export of services, you can claim refund only on realization of forex. So this time limit for realizing the forex is not there for export of services. Why? Because consideration should be in forex is one of the condition itself for export of services. So what are the 5 conditions for export of services? Where the supplier should be in India, recipient should be outside India, place of supply should be outside India, how the consideration should be convertible foreign exchange. But in 2 cases, it is permitted by RBI that the consideration can be in Indian rupees. What are the 2 cases? Number 1, if the services are provided to Nepal and Bhutan, the consideration can be in Indian rupees, it's okay. Second, if the payment is credited in special rupee ostro account maintained by a bank outside India. So this special rupee ostro account will be maintained by a foreign bank, wherein any amounts that we need to get in foreign currency will be credited in that account. Any amount which we need to pay in foreign currency will be debited from that account, so that the exchange fluctuation will not be happening, that conversion will not be happening. So this money which is credited into that special ostro account which is maintained by the foreign bank is as good as the money received in convertible foreign exchange, even though in our account the money will be received in Indian rupees. The money will not be received in convertible foreign exchange. The money will be received in Indian rupees. Means what is credited in our bank account is Indian rupees. But this Indian rupees we got from a foreign bank, that foreign bank is maintaining special ostro account, and there it was credited in foreign exchange, it is okay. That's what RBI is telling. So in 2 cases, even though the money is credited in your bank account in Indian rupees, it's okay. It is as good as it is export of service. What are the 2 cases? If the service is provided to Nepal and Bhutan and payment is credited in special rupee ostro account maintained by a bank outside India. But in other cases, the consideration should be in convertible foreign exchange. And 5th condition is that supplier and recipient are not merely establishments of the same person. For example, there is a holding company in India and subsidiary company outside India. Will it become export of service? Yes. Yes, it will become export of service, because holding company and subsidiary company are 2 different companies. If the head office is in India and the branch office is outside India, then they both belongs to the same company. So in that case, it will not become export of service. What if the branch outside India is separately incorporated as per the law of that country? Then in that case, will it become 2 establishments of the same person or different persons? Different persons. Example, I have opened a offshore unit in Singapore. This offshore unit in Singapore is incorporated under the laws of the Singapore. Means it has got a separate legal existence in Singapore. Now, even though it is my branch, when I provide service from here to there, it will not be treated as 2 establishments of the same person. It will be treated as 2 separate persons. See this note. Supply from a company incorporated in India to its establishment outside India, which are incorporated under the laws outside India, would qualify as export of services subject to fulfillment of other conditions. Then look into the next area, that is 0 rated supplies. As per section 16, what are considered as 0 rated supplies? Export of goods or services and supply of goods or services to a SEZ unit or developer will be taken as 0 rated supplies. And in case of 0 rated supplies, whether GST is paid on inward supply. So yes, because we have discussed in input tax credit, if the outward supply is 0 rated, we can avail the ITC on inward supplies. And there are two options available in case of 0 rated supplies. What are the two options? Option 1, on 0 rated supply, pay IGST. And we will get the refund. That IGST we can pay using our ITC. For example, my liability is 8 lakhs and I have an input tax credit of 3 lakhs. How much net I will pay? 5 lakhs. 8 lakhs gross liability IGST, 3 lakhs I have input tax credit, so net liability will be 5 lakhs. How much I will get as refund? Entire 8 lakhs I will get as refund. Entire gross IGST I will get as refund. The logic here is simple. On purchases already I paid 3 lakhs. Now on export I am paying 5 lakhs. So this 3 plus 5, 8 lakhs I will get as a refund. So my burden will become 0. That is what 0 rated option 1. Option 2, I will make outward supplies without payment of GST under bond or LUT, without payment of GST. In this case, what will happen is that, so I will be having some unutilized ITC on my inputs and input services, that I will get as refund, because on outward supply I am not paying any GST, but on inward supplies I have some unutilized ITC, that I will get as refund. Don't pay any GST on outward supply and supply it under bond or LUT, but get refund of ITC with respect to GST paid on inward supply, that is inputs and input services. Then next, generally online money gaming is specified actionable claims. Specified actionable claims will come under goods. So this is a very interesting point. It's an amendment. Please concentrate. Specified actionable claims are treated as goods. Online money gaming is also goods. Then when the supplier is outside India, online money gaming supplier is outside India and you are located in India, will it become import of goods? Logically yes, because specified actionable claims are treated as goods, it will become import of goods. When it is import of goods, customs duty is payable na, but they have created a carve out provision which says that even though specified actionable claims are goods, on import of specified actionable claims, customs duty not applicable, only GST is applicable. You got it? See this. The central government has notified supply of online money gaming as the goods, on import of which IGST shall be levied and collected, and not in accordance with the provisions of Customs Tariff Act. So on import of specified actionable claims, there is no customs duty, there is only IGST. Is it clear? Then this is the point which I told you. OIDR services includes online money gaming, but OIDR services excludes, OIDR service includes online gaming, but OIDR service excludes online money gaming. Therefore the provisions of OIDR service is not applicable to online money gaming, but online gaming will be treated as OIDR services. Okay. So these are the various points that we have related to charge under IGST. So there are few queries here. That is, sir, RCM deposited on capital goods under 9(4), is it blocked for ITC under 17 subsection 5? See, listen. Actually, wherever 9(4) is applicable, 9(4) is applicable to whom? Promoter or builder. And 9(4) is applicable only in case of residential properties. Wherever the GST rate is 1.5% or 7.5%, for those kind of projects only 9(4) will be applicable. So 1.5% or 7.5% rate is what? With ITC or without ITC? Without ITC, which means that can they take ITC of RCM paid under 9(4)? No, they cannot take. Please listen, concentrate. It's a very, very good question. That is, sir, 9(4) is applicable to me. I am a promoter or builder. 9(4) is applicable to me. Now, when 9(4) is applicable, if the type of construction that I am making is residential construction, only 9(4) is applicable. For commercial projects, 9(4) is not applicable. For residential projects only. Why? Because the residential projects rate of GST is 1.5% or 7.5% without ITC. So whenever I make payment of GST, I cannot take ITC. So naturally I will buy from an unregistered person. That's why to stop these people from buying from unregistered person, they brought this 9 subsection 4, where even though you buy from an unregistered person, you need to pay GST under RCM. that GST we pay under RCM under 9.4, can we take as ITC? No, impossible. We cannot take ITC. It's not because of the blocked credit. It is because the rate applicable to the promoter or builder is 1.5% or 7.5% without ITC. Then another question. Sir, in fast track batch where 9.5 was applicably mentioned, supplier will pay GST on the amount received from e-commerce operator. Yes, that is only in some specific cases. That is in case of supply of food through e-commerce operator, and the second case is that omnibus, transportation of passengers. In case of these two, even if the supplier is registered, it will be coming under e-commerce operator liability. Now the supplier will receive some money from the e-commerce operator. On that, whether supplier is required to pay GST. So for that, we have one CBIC FAQ which says that yes, the supplier is required to pay GST on that because he is a registered person and he gets that share from the e-commerce operator. Okay, but that is actually specific provision. You don't worry about that. You remember whatever I have discussed. Then, sir, on 9.5 supplies, whether supplier can avail ITC in respect of inputs used by him. In case of 9.5, who is liable to pay GST? E-commerce operator is liable to pay GST. So naturally, e-commerce operator can take ITC on their inward supplies, whatever inward supplies they have. And in case of restaurant service, the rate of GST applicable is 5% without ITC. In that case also, e-commerce operator can take ITC on inputs and input services. There is no restriction. Okay. Then next, under 9.3, are residential property given on rent for registered individual for his own stay, not his family. His family includes his own stay also. So his family does not mean something else. His family means own. What if he is a single? Throughout his life, he is a single, but he live with many girls. Then also he will be called as family only. His family means him for his purpose. Okay, I don't want to add anything extra beyond this. So it will be coming. Coloring away. So therefore, his family, I mean, what if he is not married, sir? He will stay there. That is, his family means it includes him also. Okay. Then, what if he is having different families? Okay, fine. Anything, yeah. See, export of service, I did not say related and all. What I said is that in case of export of service, the fifth condition is that supplier and recipient are two establishments of the same person. So then it is not export of service. The moment you say holding company, subsidiary company, holding to subsidiary or subsidiary to holding, they are two separate companies. So definitely it will become export of service. There is no restriction on that. Then, so you have energy? No, half an hour, just half an hour. Yes. So we will see one small area, we will complete that. That's why I am asking you. So have a look into time of supply, page 59, segment 6. Time of supply, there are total 3 sections we have. Section 31, which talks about what is the due date of invoice. Section 12 talks about time of supply in case of goods. Section 13 talks about time of supply in case of services. Section 14 talks about time of supply in case of change in rate of tax. What is the purpose of time of supply? Time of supply is for the purpose of determining the due date of payment of GST, and time of supply is for determining the exchange rate, and time of supply is for determining the rate of GST. If for any transaction, time of supply falls in this month, then by next month 20th, I need to pay GST on the transaction. So the due date of a transaction depends upon time of supply. And already we have seen Rule 34, value of supply, which says that the exchange rate prevailing on the time of supply as notified by CBIC or GAAP should be taken. So therefore, time of supply is relevant for determining the exchange rate. Third, time of supply is relevant for determining the rate of GST. On different dates, there could be different rates of GST, but we need to take the rate of GST prevailing on the time of supply. And the time of supply for a transaction depends upon the due date of invoice. That due date of invoice is given under section 31. In case of goods, we have three provisions. So, normal cases, continuous supply of goods, sale on approval or on return basis. 31 subsection 1 talks about normal cases. In normal cases, supply involves movement of goods. The due date of invoice is at the time of removal. So, on or before the date of removal, the invoice needs to be given. If supply does not involve movement of goods, at the time of delivery. So, supply involves movement of goods, supply does not involve movement of goods. What is the difference? Under the contract of supply, if the goods are taken from one place to another place, then it is known as supply involving movement of goods. Basically, this door delivery contracts or e-commerce transactions will come under supply involving movement of goods. Supply does not involve movement of goods means we go to the seller's place, we buy the goods and the supply is terminated there. Thereafter, we bring the goods. That is supply not involving movement of goods. In case supply involves movement of goods, the due date is at the time of removal. If supply does not involve movement of goods, the due date is at the time of delivery. This is 31 subsection 1 normal cases. 31 subsection 4 continuous supply of goods. In case of continuous supply of goods, what is a continuous supply of goods? There will be successive supply of goods for which the payments are settled on a periodic basis. So, frequently I will be supplying goods, but I will not collect money. So, either fortnightly or weekly or monthly or quarterly, I will be collecting money. That is called as continuous supply of goods. In case of continuous supply of goods, we need to check whether the payments are received based on account statement or the payments are received irrespective of account statement. What is this account statement? As I am making successive supply of goods, so for a periodic basis, I will prepare one account statement and I will be giving that account statement to you. Now that account statement will contain on which date, what is the value of goods that I have supplied to you. Now, some payments are collected as advances irrespective of this account statement. So, for those amounts, it is the date on which payment is received will be taken as the due date of invoice. Whereas, some amount will arise based on account statement. For example, 6,52,000. In that 6 lakhs already you paid 52,000. The differential amount you need to pay based on account statement. For that 52,000, the account statement will be taken. It is not whichever is earlier, because lot of people are understanding that account statement date or payment received date whichever is earlier. No, it is account statement date or payment received date as the case may be, which means if the payments are arising based on account statement, it is account statement date, date on which account statement is issued. If the payments are received irrespective of account statement, then the payment received date, as the case may be, it is not whichever is earlier. Then sale on approval or on return basis. In case of sale on approval or on return basis, when the invoice to be given 6 months from the date of removal or date of acceptance by the buyer, whichever is earlier. Today I deliver the goods to you, and if you confirm, then only it is considered as sale. Until that point of time, it is not sale. You confirmed within 6 months. The date on which you confirm, that is the date of sale, I will raise invoice. Suppose you have not confirmed within 6 months, deemed that on expiry of 6 months you confirm and I will raise invoice. Now, say after 6 months you return the goods, but already on expiry of 6 months I prepare the invoice. Now you return the goods. What should I do? In that case, I need to give you a credit note cancelling this invoice. So, what is the due date of invoice in case of sale on approval or on return basis? 6 months from the date of removal or date of acceptance by the recipient or buyer, whichever is earlier. Then, in case of services, we have 3 subsections. Subsection 2 is normal cases, subsection 5 is continuous supply of service, and subsection 6 is cessation of service. In normal cases, so we need to check, is it banking sector or insurance sector or others. in case of banking or insurance, the due date of invoice is 45 days from the date of completion. In case of others, it is 30 days from the date of completion. So banking or insurance, 45 days from the date of completion. Other cases, 30 days from the date of completion. Then continuous supply of service. What is a continuous supply of service? A service which takes more than 3 months. Remember, more than 3 months and involves periodic payment obligations. Both should be there. If a service takes more than 3 months to complete and there is no periodic payment obligations, it is not treated as continuous supply of service. Or if the service takes less than 3 months to complete but involves installments, that is also not continuous supply of service. Both the conditions should be satisfied. It should take more than 3 months to complete and should involve periodic payment obligations. Then in case of continuous supply of service, whether the due date of installment is ascertainable from the contract. Yes, the due date of installment will be taken as the due date of invoice. If due date of installment is not ascertainable from the contract, but the installments are based on some milestone events, so that is completion of an event. As and when the event is completed, that date will be taken as the due date of invoice. Suppose if the payment due date is not given in the contract, or even the payment is not linked to completion of an event, as and when the installment amount is received, that date will be taken as the due date of invoice. Date of installment ascertainable from contract, such due date of installment. Due date of installment not ascertainable from contract, as and when payment is received. Payment is linked to completion of event, as and when the event is completed. Then in case of cessation of service, immediately upon cessation, we need to give the invoice. Cessation refers to abruptly stopping the service, is known as cessation of service. Immediately upon cessation, with respect to the proportionate amount retained, the invoice needs to be given. So this is about due date of invoice in case of goods and services. Then section 12 talks about due date of invoice, time of supply in case of goods. Section 13 talks about time of supply in case of services. In that we have some situations. First situation is time of supply in case of FCM. Second is time of supply in case of RCM. Then time of supply in case of vouchers, and time of supply in residual cases, and time of supply on account of interest, late fee or penalty for delay in receipt of consideration. And in that, this vouchers point, residual cases and interest late fee is common between 12 and 13. There is no change in the provisions. Whereas in case of FCM and RCM, there is a change in the provision. First look into 12 subsection 1 and 13 subsection 1. So this subsection 1 says that liability to pay GST is determined on the basis of time of supply. So the purpose of time of supply is given in subsection 1. Then subsection 2 you see, 12 subsection 2. When 12 is applicable, goods. Subsection 2 is applicable when FCM. You have to remember with subsections. So 12 is goods. Subsection 2 is FCM. Goods FCM. What is the provision? See there. In case of a person opting for composition scheme and specified actionable claims, that's an amendment. In case of a person opting for composition scheme and specified actionable claims, what will be taken as the time of supply? It is due date of invoice, actual date of invoice, or date of payment, whichever is earlier, which means whether GST payable on advances. Yes, for a person opting for composition scheme and for specified actionable claims, GST payable on advances, because date of payment is also one of the date there, you understood. Whereas for others, so what will be taken as the time of supply? Due date of invoice or actual date of invoice, whichever is earlier. This date of payment is not there, which means GST is payable on advance or not payable on advances, not payable on advances. So be careful with respect to this. In MCQ they will test time of supply in case of FCM 12 subsection 2. In case of person opting for composition scheme and specified actionable claims, time of supply is ADOI. ADOI means actual date of invoice. DDOI means due date of invoice or date of payment, whichever is earlier. So GST payable on advances or not? Yes, GST payable on advances. Whereas in other cases, it will be only 2 dates. Date of payment is not there. So actual date of invoice, due date of invoice, whichever is earlier, GST not payable on advances. Whereas in case of services under FCM, that is which section? 13 subsection 2. 13 subsection 2, services FCM. Simple. whether invoice is given within the due date. Yes, invoice is given within the due date. Then take the actual date of invoice or date of payment, whichever is earlier. If invoice is not given within due date, take the completion date or payment date, whichever is earlier. What is the time limit within which invoice to be given? General cases, 30 days from the date of completion or 45 days from the date of completion is there na? That is the due dates. So if the invoice is given within the due date, date of invoice or date of payment, whichever is earlier. If invoice is not given within the due date, then completion date or payment date, whichever is earlier. As date of payment is one of the date for determining time of supply, whether GST payable on advances. Yes. Then look into subsection 3, 12 subsection 3. When 12 subsection 3 is applicable, when 12 is applicable, goods. When subsection 3 is applicable, RCM. In case of goods RCM, what will be taken as the time of supply? 3 points. The date on which goods are received. In case of RCM, we need to determine from whose perspective? Recipient perspective. The date on which goods are received, or the date on which payment is made to supplier, or 31st day from the date of invoice, whichever is earlier. Date on which goods are received, date on which payment is made to supplier, or 31st day from the date of invoice, whichever is earlier. As date of payment is one of the date here, so GST payable on advances. Then next, in case of 13 subsection 3, when 13 is applicable, services. When subsection 3 is applicable, in case of RCM. So what should be taken as the time of supply? Date on which payment is made to supplier, or 61st day. Here 31st day, here it will be 61st day. Here date on which goods are received, that is not there. Okay. Date on which payment is made to supplier, or 61st day from the date of invoice, whichever is earlier. Again here, as date of payment is one of the date for time of supply, GST payable on advances. Generally, GST is payable on advances in all cases. Exception only one case, GST not payable on advances. What is that? Goods, FCM, other than composition scheme or specified actionable claims. Then subsection 4, 12 subsection 4 and 13 subsection 4, that is common for both goods and services. This is in case of vouchers. In case of vouchers, what will be taken as a time of supply? Check whether it is identifiable voucher or non-identifiable voucher. In case of identifiable voucher, at the time of issuance of voucher. Identifiable voucher means against which product or service you are going to redeem that voucher is known at the time of issuance. So at the time of issuance itself will be taken as the time of supply. Whereas non-identifiable voucher means you can redeem it against any product or service of the supplier. Therefore, we don't know against which product you will be redeeming. So due to that reason, the time of supply will be at the time of redemption. So identifiable voucher at the time of issuance of voucher, non-identifiable voucher at the time of redemption. And then 12 subsection 5, residual cases. In residual cases, again this is common between goods and services. Residual cases, you check whether they are required to file any periodical return. So if they are required to file periodical return, who is required to file periodical return? A registered person is required to file periodical return. The due date of that return itself will be taken as the time of supply. Where periodical return is not required to be filed. Who is not required to file periodical return? So unregistered person. So unregistered person is not required to file periodical return. Whenever they pay GST, that date will be taken as the time of supply. So where periodical return has to be filed, due date of filing such return. Periodical return not filed, date of payment of GST. Subsection 6, residual cases. In residual cases, what will be taken as the time of supply? Sorry, subsection 6 is interest, late fee or penalty for delay in receipt of consideration. Interest is always taxable on receipt basis. Whenever we are actually receiving the interest, we need to pay. Which interest? Is this interest on loans, advances, deposits? No, because interest on loans, advances, deposits is exempted. This is interest on account of delay in receipt of consideration. So GST is payable on receipt basis. Under GST, everything will be payable on accrual basis. Only this interest on late fee, interest or late fee or penalty for delay in receipt of consideration payable on receipt basis. This is with respect to 12 and 13, and there are some additional points in this regard. What will be taken as the date of payment? So usually date of payment from the supplier point of view is date of entry in their books or date of credit in their bank account, whichever is earlier will be taken. Whereas from recipient point of view, if you see opposite, what is that? Date of entry in the books or date of debit in their bank account, whichever is earlier. Then in case of goods covered under FCM, on advances GST not payable generally, correct. Exception is we have seen composition schemes, specified actionable claims, and GST is payable only upon invoice as the time of supply is date of invoice or actual date of invoice, whichever is earlier. But in case of service under FCM, GST is payable on advances. As GST is payable on advances in case of services, if you are receiving any excess amount beyond the invoice, for that excess amount, what will be the time of supply? For example, I raised invoice for 11,200, but you paid 12,800 rupees you paid extra. For that 800 rupees, this month I am receiving 800, but this 800 will be reflected in the next month bill. So invoice is next month, payment is this month, whichever is earlier means I have to pay GST this month. But it will be administratively inconvenient. For that there is one proviso which says that if the excess amount is up to 1000 rupees, what is the excess amount here? 800, which is up to 1000 rupees. Either we can pay based on invoice itself or as per the normal provisions. As per normal provisions means invoice or payment whichever is earlier, or the date on which invoice is raised, as the case may be. Supplier has the option to choose. See this, up to 1000 rupees received in excess of the invoice. In case of services covered under FCM, time of supply can be date of invoice or determined as per 13(2), and the supplier has options to choose. Then in case of supply of services between associated enterprises, who are associated enterprises as per section 92A of Income Tax Act, we have now a list of associated enterprises. Basically it is 26%. One company or one person holding 26% in the other will become associated enterprises. In case of associated enterprises, import of services, generally import of service will come under RCM. So what will be taken as a time of supply? Import of services, RCM. RCM services, what is the provision? 13 subsection 3, date on which payment is made to supplier or 61st day from the date of invoice. But in case of associated enterprises, we are removing 61st day from the date of invoice and we are taking the date of entry in the books of the recipient, whichever is earlier. So what is the provision? So the date on which payment is made to supplier or date of entry in the books of recipient, whichever is earlier. Then when the goods are taken outside India for exhibition, is it supply or not a supply? Not a supply. But if the goods are not brought back within 6 months, the deeming fiction under 31 subsection 7 will be applicable, like sale on approval or on return basis. As the goods are taken for exhibition, not brought back within 6 months, on expiry of 6 months, it is deemed to be supply and invoice needs to be raised. That is this. When goods are taken outside India for exhibition, it is not a supply. But when the same is not brought back within 6 months, it is deemed to be supply in terms of 31 subsection 7. Then the last section that we have is section 14. So section 14 talks about time of supply in case of change in rate of tax. So in case of change in rate of tax, when the section 14 will be applicable? Mainly section 14 is applicable in case of services. Okay. So applicable only in case of services, and it is also applicable in case of person opting for composition scheme and specified actionable claims. Okay. So first you should know to whom this section 14 is applicable. This section 14 is applicable only in case of services. Also applicable in case of composition scheme and specified actionable claims. But practically it is irrelevant. Why? Because in case of composition scheme, the rates will be always same, 1%, 5%, etc. And in case of specified actionable claims also, the rate will be always same. What is that rate? 28%. So this change in rate concept will not be coming. So practically the section 14 is applicable only in case of services. Now when 14 will be applicable? Services. What is the situation where 14 is applicable? Between 3 dates there is a change in rate. What are those 3 dates? Date of completion, date of invoice or date of payment. Between these 3 dates there is a change in rate, then 14 will come. And in that we have 2 scenarios. What is that? 14A, supply before change in rate, means the completion is before change in rate. And then what should be taken as the time of supply? Very simple. invoice or payment, whichever is earlier. Say this, suppose if the completion is before change in rate, then invoice date or payment date, whichever is earlier. Suppose if the supply is after change in rate, then what you need to do? Then check whether both invoice and payment is before change in rate or one before, one after. If both invoice and payment before change in rate, whichever is earlier. If one is before, one is after, then it will be taken as whichever is later. Invoice date or payment date, whichever is later. Now, what will be taken as the date of payment? Generally, what is the meaning of date of payment? Date of entry in the books or date of credit in the bank account, whichever is earlier. However, in case of section 14, if the payment is credited in the bank account within 4 working days from the change in rate, then only it will be entry date or credit date, whichever is earlier. Okay, if the payment is not credited within 4 working days from the change in rate, then the date on which payment is credited only will be taken as the date of payment. So, date of payment for section 14 is date of entry in the books or date of credit in bank account, whichever is earlier, when if the payment is credited within 4 working days from change in rate, or date of credit in the bank account if the payment is credited after 4 working days from the change in rate. Now, let us see how this section 14 will have an impact. So, there is a change in rate. There is a change in rate with effect from 1/5/2023. There is a change in rate with effect from 1/5/2023. Now, date of completion, then date of invoice and date of credit, date of credit, date of entry, date of credit where? In bank account, date of credit in bank account, date of entry in books. Now, based on this, you need to determine what is the date of payment and you need to determine what is the time of supply and what is the rate of GST, whether old rate or new rate is applicable. Okay. Now, let us see this. Date of completion is 15/4/2023 and date of invoice is 30/4/2023 and date of credit in the bank account is 2/5/2023, but the date of entry is 28/4/2023. Okay. Now, what should be taken as the date of payment? So, as the payment is credited within 4 working days, we will assume that all days are working days from 1st May, because 1st May we do not have any holidays and all. So, all days are working days. So, 2/5 is within 4 working days, correct or not? As the payment is credited within 4 working days, so due to that reason, we will take date of credit in the bank account or date of entry in the books, whichever is earlier, which is earlier 28/4/2023. Now, in this case, if you see, completion is before change in rate, invoice also before change in rate, payment also before change in rate, correct? Normal provision. What is that normal provision? Invoice or payment, whichever is earlier. Which is earlier? Which is earlier? So, 28/4/2023, that is invoice date or payment date, whichever is earlier will be taken. And what is the rate that will be applicable? Old rate will be applicable. So, like that we need to determine. Now, see, 15/4/2023, invoice is 5/5/2023 and date of credit in the bank account is, so 3/5/2023 and the payment date of entry in the books is 28/4/2023. Now, what will be taken as the date of payment? Same, 28/4/2023 as the payment is credited within 4 working days. So therefore we need to take 28.4 and 28.4 or 5.5, whichever is earlier, even though invoice is given at the new rate, but old rate only will be applicable. 28.4/2023 old rate will be applicable. Next, another example. Say if the completion is 15/4/2023, date of invoice is 5/5/2023 and the credit is happening on 10/5/2023, but the entry is 28/4/2023. Whether the payment is credited within 4 working days? No, not within 4 working days. When it is not within 4 working days, what will be taken as the date of payment? Date of entry in the books only will be taken, or date of credit in the bank account will be taken? Date of credit in the bank account will be taken. Now what will be taken as the time of supply? Date of invoice or date of payment, whichever is earlier. So 5/5/2023, what is the rate that will be applicable? New rate will be applicable. Okay. Then next, suppose if the completion is 8/5/2023 and the invoice is 28/4/2023, payment is credited on 3/5/2023 and 29/4/2023. So what will be taken as the date of payment? Is the payment credited within 4 working days? Yes, the payment is credited within 4 working days, and as the supply is after change in rate. Supply is after change in rate. Carefully see the provision. Supply is after change in rate. And one before, one after, or both before? Both before. Both invoice and payment before change in rate. So we need to take date of payment is 29/4/2023, no change, but we need to take whichever is earlier or whichever is later. Whichever is earlier. Why whichever is earlier? Because both is before change in rate. Whichever is earlier, that is 28/4/2023, old rate will be applicable. Now suppose 8/5/2023, so 28/4/2023, the payment is credited on 10/5/2023, but the account entry is 29/4/2023. It is not within 4 working days. Now what will be taken as the date of payment? Date of payment will be 29 or 10? 10. So 10/5/2023 will be taken, and date of invoice is before change in rate, payment is after change in rate. So one before, one after, means we need to take whichever is later. Why? Because this is supply after change in rate. So whichever is later. Which is later? 10/5/2023. So what will be the rate that is applicable? New rate will be applicable. Like that, any combination they can give in question. You be careful on the provision. What is the provision you need to remember? Completion before change in rate, invoice date or payment date, whichever is earlier. Completion after change in rate, both invoice and payment before change in rate, whichever is earlier. One before, one after, whichever is later. What is the meaning of date of payment? Payment credited within 4 working days from the change in rate. So credit date or account entry date, whichever is earlier. Payment not credited within 4 working days, date of credit in the bank account only will be taken as the date of payment. So that is about 14. Then with this we completed this time of supply also. And let's see the queries and we will wind up the session. Why section 14 is not applicable in case of change in rate of goods? Because of notification 66/2017. There is one notification 66/2017 which says that, so for goods covered under, supply of goods, always we need to take due date of invoice or actual date of invoice, whichever is earlier. Even though section 14 is applicable for goods, but we need to take always due date of invoice, actual date of invoice, whichever is earlier, because of the notification 66/2017. Then next, based on square feet of house and SDV of house, rates will be determined 1.5. So 1.5, 7.5 is not in syllabus. When 1.5%, when 7.5%. So don't break your head. Whatever is there in syllabus, that itself we don't have time to learn. Okay. So don't think too much about it. It will be given in the question itself. Okay. That's it. Fine. Thank you. And we will continue with the exemptions tomorrow. So in tomorrow's session, we will be completing exemptions under GST and followed by place of supply and even refunds and other topics. Okay, it will continue. Thank you. We'll meet tomorrow. So in the last session, we completed up to time of supply, and let's proceed to exemptions under GST, segment 5, page number 40. So in these exemptions, already some of the exemptions are there which is covered under the RCM discussion. So these are the other exemptions that we have, and in that even that discussion also will be coming. Agriculture related services is the first sector. In that we have only 5 exemptions. Any service in relation to agriculture or agricultural produce is exempted. So I am providing some services that is in relation to agriculture or that is in relation to agricultural produce. Now whatever money that I receive will be exempted. What is the meaning of agriculture? Agriculture means the activity, cultivation of plants as well as rearing of life forms of animals other than horses. For what purpose? For food, fiber, fuel, raw material or any other similar produce. So therefore sericulture will come and even fishing will come, but horses will not be coming. So because horses is no way connected to the agriculture, that's why except the rearing of horses. And for what purpose? Food. So food in the sense poultry, etc. Fiber, that is sericulture. Fuel, cattle farming. Raw material, honeybee farming or any other similar products. Agricultural produce means the primary produce out of agriculture on which no processing is done or some other processing as is usually done by a cultivator or producer, so which does not alter its essential characteristics but makes it marketable for the primary market. So which means that, so whatever we get out of the agricultural produce, so that is agricultural produce, whereas if you process it, it will not become agricultural produce. What if the process does not alter the essential characteristics? Then still it is agricultural produce. Example, tender coconut is agricultural produce, and even coconut is also agricultural produce. Copra is also agricultural produce. These are the process which is usually done by the cultivator, which does not alter its essential characteristics. Due to that reason, it will be coming under agricultural produce. But using the coconut, if you extract the coconut oil or coconut milk, etc., that will not be coming under agricultural produce because that will be processed. Okay, so then paddy is an agricultural produce because paddy is the primary produce out of agriculture, whereas rice is processed, but this processing from paddy to rice is not usually done by the cultivator, so it will be done by the rice mills and that will not be coming under agricultural produce. But as rice is not an agricultural produce, in relation to rice, few activities are exempted. What are they? Loading, unloading, packing, storage or warehousing is exempted. Only 5 activities: loading, unloading, packing, 4. So storage or warehousing, both are same. These 4 activities in relation to rice is only exempted. And why? This rice is not separately given because rice is not an agricultural produce. What about these activities in relation to agricultural produce? Anyhow, it is covered in the first point itself. Any service in relation to agricultural produce, there it will be covered. For example, storage and warehousing of fruits and vegetables, it's covered in the first point itself. Storage and warehousing of paddy, it's covered in the first point itself. So like that, all these activities in relation to agricultural produce is already covered in the first point. Then what is the importance of the second point? The second point is only for the rice, as rice is not an agricultural produce. And then artificial insemination of livestock is exempted. Artificial insemination means through an artificial process. So whenever we make the reproduction, for that some injections and all will be given to the cattle, etc. So that artificial insemination is not directly in relation to agriculture. Due to that reason, separately it has been given. Service by way of storage or warehousing of cereals and pulses. Sir, what about other goods? See, storage or warehousing of agricultural produce is already covered in the first point. That's what I said. Warehousing of fruits, vegetables and other agricultural produce is covered in one above, therefore it is exempted. So this cereals and pulses is not agricultural produce. Due to that reason, separately they have given exemption for this. But what if it is agricultural produce, like a whole grain like rajma, channa, etc. is an agricultural produce? It's already covered in the first point. What if it is dal, which is processed? So from the whole grain we remove the husk and we process it. So that dals is not agricultural produce, even though it is not agricultural produce, but its storage and warehousing is exempted. Then warehousing of minor forest produce. Warehousing of minor forest produce. Again, minor forest produce is not agricultural produce because it is available in the forest, and this like bamboo, honey or lax, there are some goods like shikakai, these are all some Ayurvedic herbs, so which will not be called as agricultural produce, but its storage is exempted. So therefore, there are three agricultural, like not an agricultural produce. Rice is not an agricultural produce, cereals and pulses is not agricultural produce, minor forest produce is not agricultural produce, but its storage or warehousing is exempted. So these are the only exemptions that we have in relation to agriculture sector. And is there anything that is taxable? Yes. Suppose if the activity is not in relation to agriculture, then it will be taxable. So what are the examples that will be coming in the first point? So farmer education and training. Farmer education and training is in relation to agriculture. Definitely it will be exempted. Seed testing, soil testing, renting of agro machinery, these are all in relation to agricultural produce. But processing of tomato ketchup. So tomatoes we take and we get the tomato ketchup. Won't it come under service in relation to agricultural produce? No. See the output. Output is what? Tomato ketchup. That is not an agricultural produce. Due to that reason, this processing of tomato ketchup will not come under agricultural activity. So it is taxable. Okay. Then next, second sector is insurance services. In case of insurance services, we have few exemptions. Service of life insurance business provided by way of annuity under National Pension System. So remember NPS trust. If NPS trust is collecting any amount towards the insurance, that amount collected by them will be exempted. Then group life insurance funds. There are 5 group life insurance funds, that is Army, Navy, Air Force, Coastal Guard and Central Armed Police Forces. So these 5 group insurance funds are only exempted. Basically the objective of group insurance fund is that, so there will be some group of people and they will be contributing every month some amount towards the insurance, and if there is anything that happens to the member of that group, to their family members, a monetary support will be made out of that group insurance fund. But not all group insurance funds are exempted. Only 5 group insurance funds are exempted, that is Army, Navy, Air Force, Coastal Guard and Central Armed Police Forces. Then service of general insurance business provided under government schemes. So general insurance, there is a general insurance company which is providing general insurance services. So that can be any insurance company. It can be like, private company, or it can be a government enterprise. There is an insurance company. That insurance company is providing general insurance services, but that general insurance scheme is notified by government. Under that scheme notified by government, if they receive any premium, that premium collected will be exempted. So these general insurance which are notified schemes under government schemes. What are those government notified schemes? Basically these are related to agriculture and farmers, below poverty line, women. So then that will be exempted. Example, seed crop insurance, then coconut palm insurance, hut insurance. These are all some examples wherein the premium collected will be exempted. Apart from that, extra one more point, remember Nirmaya health insurance. Nirmaya health insurance is also exempted. Then fourth point, there is an insurance company. That insurance company can be government owned or a private one. They are providing now life insurance services. That life insurance schemes are notified by government. Now whatever premium that is being collected, that will be exempted. So what is that government notified schemes? Usually it ends with the word Yojana. So Pradhan Mantri Jeevan Jyoti Bima Yojana, Pradhan Mantri Vayavandhan Yojana, Pradhan Mantri Jan Dhan Yojana. These are some Yojana. So if you see the word Yojana, definitely it's a government scheme. So whatever premium that is being collected, that will be exempted. See, yes, there are some big list of schemes, but there is no point in remembering. So for the sake of this one, just one point, you don't have to remember that and all. So definitely it will be a notified scheme only that will be given in the question, don't worry. And then micro life insurance having the maximum sum assured as 2 lakh rupees. Suppose if the micro life insurance is given, but the sum assured is 2,50,000, whether the premium will be taxable or exempted, that premium will be taxable. So two conditions here. First, the insurance should be a micro life insurance. Micro life insurance means a small amount of premium will be involved, and the maximum sum assured should be 2 lakhs. Then the premium collected will be exempted. Then insurance services provided to government. So any insurance, let it be life insurance or general insurance services provided to government. So government will be taking insurance from the insurance companies with respect to its employees or its plant and machinery or buildings, etc. So in that case, government will pay the premium. So this is basically services provided to government, that is insurance service provided to government. Whatever premium that is collected from the government, the premium will be exempted. Then reinsurance of any exempted insurance is also exempted. For example, we are providing insurance to government for which we collect the premium from the government, that premium is exempted. Now our insurance company takes insurance with another insurance company and we pay the premium. This concept is known as reinsurance. So as the main insurance is exempted, its reinsurance is also exempted. Then services provided by business facilitator or business correspondent to insurance company in rural area. We discussed that in insurance agent services to insurance company. So whatever business facilitator or business correspondent for insurance company working in rural area, the commission earned by them will be exempted. So these are the 7 activities that we have in relation to insurance services. Then next, banking and other financial services. In case of banking and other financial services, we have various exemptions. In that, the first exemption is there is a transaction involving money without consideration. We already know that it is neither goods nor services, because money is excluded from the definition of both goods and services. So but what if there is a transaction in money for a separate consideration? Transaction in money for a separate consideration is treated as service. Now we need to check whether the consideration is represented by way of interest or discount on loans or advances, then that will be exempted. If it is any other consideration, that will be taxable. Any other consideration means what? Interest involved on credit cards, commission, debit card charges, credit card charges, minimum balance non-maintenance charges, annual maintenance charges, like that, all these charges will be taxable. So suppose if the transaction in money is without consideration, neither goods nor services. If it is for a consideration, such transaction is treated as service, and the consideration is interest or discount, then it is exempted. If the consideration is any other consideration including interest involved in credit cards, that will be taxable under FCM. Then next, second point, there is a banking company which is providing services to basic savings deposit account holders under Pradhan Mantri Jan Dhan Yojana. So under PMJDY scheme, some people will be allowed to open nil balance accounts. So these savings accounts holders may receive some services from the bank, for which bank will collect some charges from them. That charges collected from them will be exempted. Interest anyhow exempted. Even other charges collected from these savings account holders is exempted. What if it is a normal savings account holder? The charges collected from them will be taxable. Only if it is basic savings deposit account holders under PMJDY scheme, it is exempted. Then third point, forex transactions, that is money changing one currency to another currency. If the foreign exchange transaction takes place between banks or between forex dealers or between banks and forex dealers, whatever consideration that is involved will be exempted. Suppose if the transaction of money changing or foreign exchange is happening between bank or forex dealer and the customer, so whatever charges that is being collected will be taxable. And whatever FCM, RCM, we already learned what are the list of services which are covered under RCM. So here you don't focus on whether it will be FCM or RCM, because already you know what are the RCM. So therefore whatever we are seeing as taxable, if it is not covered under RCM, it will be by default FCM. Then next, fourth point, services by an acquiring bank. Basically this acquiring bank, what they will do is that acquiring bank will do the settlement of the transactions between the vendors and the purchasers. So purchaser, when they are using the credit card or debit card or any card, so money will be debited from their account and it will be given to the vendor account, and one bank will be doing this. That bank will be called as acquiring bank. That acquiring bank, as they do the settlement, they will be collecting some processing charges, processing fees. This processing fees is not exempted. Processing fee will be there, but GST on processing fees will be exempted if the transaction amount is up to 2000 rupees. Suppose if you are using the card up to 2000 rupees, the processing fee will be there, but on that processing fee there is no GST. What if it is a UPI transaction? If it is a UPI transaction, already we know that there is an incentive which is paid by the Ministry of Information and Electronics, so to the acquiring bank. Due to that reason, there won't be any processing charges, and these incentive, whatever they are collecting, there won't be any GST on that, because this incentive will be treated like subsidy from government. So there is no GST on that. But mainly this particular exemption is given in case of card payments only, not in case of online payments. So physically card when we are using, then only it will be called as a card payment. Online when you are using, it will not be called as card payment, it will be authentication. So authentication is through card, but does not mean we are making payment through card. So therefore this exemption is only in case of card, credit card, debit card, charge card or any other payment card service. What you need to remember is that GST on processing charges for a transaction up to 2000 rupees is exempted. Then fifth point, there is an intermediary. This intermediary is located in multi-service SCZ. This multi-service SCZ, we have only one multi-service SCZ, that is Gift City in Gujarat. So in that place, when there is a person who is providing services to their customers outside India, so intermediary is in India, they are providing services to their customers outside India in relation to foreign currency. Now it won't become export of services. Why it won't become export of service? Because in case of intermediary services, the place of supply as per section 13 will be location of supplier. In order to become export of service, 5 conditions should be satisfied. Supplier should be in India, recipient should be outside India, consideration should be in convertible foreign exchange, place of supply should be outside India, but here place of supply will become India, therefore it won't become export of service. But here also there involves foreign exchange process. Due to that reason they have given this as an exemption. So as it becomes export of services, anyhow the burden will become zero. But here it is not export of service, that's why they brought it under exemption. What you need to remember is that there is an intermediary who is located in multi-service SCZ with the IFSC status. They are providing services to their customers outside India, for which they are collecting some consideration. That consideration collected by them will be exempted. That is this. So then health services, in case of health services, we have only 2 exemptions at present. So number 1, health services provided by a clinical establishment, authorized medical practitioner or paramedics, including ambulance service, is exempted. This is the first exemption. Second exemption is healthcare service in relation to animals or birds. So previously we had some more exemptions like biomedical waste treatment operator, now it is taxable. And cord blood banks, one exemption was there, that is also now taxable. Only these 2 exemptions are there. One is related to human beings, another is related to animals or birds. In that first one, healthcare services means what? Healthcare services means pre-treatment, that is diagnosis. Diagnosis includes X-ray, scanning, etc. And treatment, so carrying out any treatment including surgery, operation. Post-treatment, that is keeping the patient in observation for the purpose of providing the care till the time the person is discharged, the patient is discharged for any disease, illness, injury, pregnancy in any recognized system of medicine. Any recognized system of medicine, there are various recognized system of medicines like allopathy, homeopathy, Siddha, Unani, Ayurvedic, like that, in any recognized system of medicine, including transportation of patient in ambulance. So patient in ambulance, whether it is part of healthcare or not part of healthcare, here separately also ambulance service is given, as a part of healthcare also ambulance service is given. So whether the transportation of patient is a part of healthcare, means for providing any treatment, or not as a part of healthcare, so normally also it will be exempted. But only transportation of patient in ambulance is exempted. Transportation of any other passenger in ambulance will become taxable. Then next, healthcare services does not include cosmetic surgery, plastic surgery and hair transplantation, because these 3 will not come under healthcare services. However, if these 3 are carried out to restore the anatomy of body parts affected due to congenital defects means by birth, or developmental abnormalities during the growth stage, or any injury or trauma, so then in that case, whatever cosmetic surgery, plastic surgery or hair transplantation that is being done will come under healthcare services, and that will be exempted. So this healthcare services should be by a clinical establishment. Clinical establishment means a place where healthcare service is provided, that can be nursing home or a clinic or a hospital or any other place, or authorized medical practitioner. Medical practitioner here is a person who is having minimum qualification MBBS and is registered with the Indian Medical Council. Or paramedics. Paramedics means, so those who assist the doctors like nurse or a lab technician, physiotherapist or compounders, they will be coming under paramedics. So these services provided by them will be exempted. All healthcare services are exempted. However, room charges, there is one exception. Generally, room charges is also part of healthcare service and it is exempted. However, if the room charges is ICU charges, we don't have any restriction, always it will be exempted. So ICU can be critical ICU or normal ICU or neonatal ICU, any ICU charges will be exempted, whatever may be the amount. But normal room charges will be there. That normal room charges will be exempted if per day it does not exceed 5,000 rupees. What if it exceeds 5,000 rupees per day? Entirely it will be taxable. So for room charges alone, we have one taxability. If it is normal room charges which exceeds 5,000 rupees per day, then it will be entirely taxable. Otherwise, all healthcare services will be exempted. Then healthcare service in relation to animals or birds is also exempted. Then we have few circulars in this regard. Renting of rooms to inpatients in hospital subject to the point, that 5,000 rupees point, and food supplied to inpatients. Who are inpatients? Those who are admitted in the hospital is known as inpatients, is part of healthcare services and it is exempted. Not only this, even medicine sold, food supplied, everything given to the inpatients and charge it from them will be exempted. The next point is related to consulting doctors. So there is a consulting doctor who is not an employee of the hospital, he is getting some money from the hospital, that will be exempted. So money collected by the hospital from the patient is also exempted for consulting, that is outpatients. So even money collected by the doctors from the hospitals is also exempted. Then services provided by way of ART or IVF treatment for the purpose of curing the abnormality related to pregnancy. So this IVF or ART treatments will be done. Then whatever amount that is collected for that is mainly for curing an ailment or curing a deformity, so or abnormality. Due to that reason, it will also be treated as healthcare services, and the money collected for IVF treatment will be exempted. Then next, there is a rehab professional. This rehab professional is not a doctor. So basically they are psychology experts and they will be possessing the psychological degree, and they will be registered with the Rehabilitation Council of India. They will be providing rehab services by way of care or counseling if they are working in medical establishments. Let that medical establishment be government or private or a trust, it will be always exempted. Or an education institution, let it be government or private or a trust, it will be exempted. But what if they are working in rehab centers? If they are working in rehab centers, if that rehab centers is operated by government or trust, then only the money collected by them will be exempted. If there is a private rehab center, then the money collected by the rehab professional will be taxable. Okay, service provided by rehab professionals in private rehab center will be taxable. Only if they are working in government or a trust-owned rehab center, then it will be exempted. But when it comes to medical establishments and education institutions, let it be government or private or trust, there is no difference in that. The next one we have is entry tickets. Sir, does audio logistics come under authorized medical practitioner? I don't know here. So I don't know much about medicine, and if it is given in the question that he is an authorized medical practitioner, he will be coming. So I don't know what is that word also, audio logistics, etc. So logistics means I know only transportation. So therefore sorry for that. Maybe you mean to say some expert in something. So if they are really authorized medical practitioner, yes, they are covered under exemption. Then even recognized system of medicine, there are many recognized system of medicines, but some unrecognized system of medicines are also there, like pranic healing or Reiki healing, like that. So with respect to that, it will be always taxable. But again, it will be given. Suppose if they coin a new term and all, that will be clearly given as to whether it is a recognized system of medicine or not. Because even CA Institute know that we are not, studying for doctor degree. And yoga, remember, it is a recognized system of medicine. Yoga is covered. Then next, so feels that your lectures are fully packed. End of the day, feels that my head is bursting. So take class for 3 to 4 hours. You watch for 3 to 4 hours. Afternoon you take rest, and thereafter tomorrow you continue watching. No, it's anyhow in YouTube, correct? So you can watch. What's wrong in that? Then this and all you are asking us doubts here. Disturbance in audio? I don't think so here. Maybe my throat issue. Ask queries here. Don't disturb me in this. Following entry tickets. That's why I stopped for last 2 attempts taking online live. Rocket revision and all I stopped taking online live because they will be asking like this only questions. Anyhow, if I upload a lecture, students will say, sir, online live you are not doing, sir, etc. If I put online live, no, so students will not come. Hardly 50 students or 60 students will be there. But in the group, no, 200, 300 students will be asking me online live like that. And again, if I put online live, so 6 hours I cannot study. Then what other work you have? Study here. Exams are coming. You have to put effort. So you should not be always in the comfort zone. You have to come out of the comfort zone. Only when you come out of the comfort zone, the magic will happen. So you cannot say, no, I will sit in the comfort zone only and everything should come into my place only. Then better create a clone and send them for exam, or use some artificial robot and send them for exam. You do at least that thing. So if you are writing, you have to put effort, no other go. Fine, say this. So entry tickets, following are the entry tickets which are exempted. So irrespective of the ticket price, some entry tickets are exempted. If the ticket price does not exceed 500, some entry tickets are exempted. So irrespective of the ticket price, so we have first related to animals, museum. So related to animals, we have zoo, tiger reserve, then we have wildlife sanctuary. These three are related to animals. Then three places, museum, national park, protected monuments. These 6 alone you remember, but these 2 are actually events which were already completed. So I don't think so questions will be asked on this, but these 6 you need to remember: tiger reserve, zoo and wildlife sanctuary. Whereas the remaining 3 are places, museum, national park and entry to protected monuments. Then ticket price does not exceed 500. So total 9 points you need to remember. First 4 are related to performance related. Performance related means dance and then theatrical performance, then concert and musical performance. This is related to performance. One person is performing. Whereas related to events we have 4: circus, award function and page and beauty show and sporting event. Then one place, that is planetarium. These are the 9 entry tickets which are exempted if the ticket price does not exceed 500. What if the ticket price exceeds 500? Entirely it will be taxable. Then next, what about pharmacies? So one question they have asked, pharmacy related to the previous point. I told you already, medicine sold to inpatients is exempted. Anything which is sold to inpatients or anything which is given to the inpatients will be exempted. If it is to outpatients, then it will be taxable. Means pharmacy should maintain separately with respect to outpatients, inpatients, billing they need to maintain separately. With respect to the billing, they will divide as to whether it will be taxable or exempted. A medicine may be taxable, but the moment it is sold to inpatient, that medicine will become exempted. Suppose if the same medicine is sold to outpatient, it will become taxable. Means a hospital should maintain separate billing related to that. Then next one, pension services. So pension services is related to 2 pension services are exempted, that is Atal Pension Yojana and state government operated pension fund. Atal Pension Yojana is a central government operated pension scheme and state government operated pension fund is also exempted. Okay, so these 2. Apart from that, if there is a private pension fund, whatever premium or whatever contribution that is being collected towards the pension fund will be taxable. Like there are Motilal Oswal, Religare and like SBI, like that lot of pension funds are there, but these are private pension funds. So monthly they will collect some contribution that will be taxable. Only Atal Pension Yojana or state government operated pension fund, the money collected is exempted. And then next one, number 7, services by some specified organizations. These are the specified organizations. If they collect any amount, that amount collected by them will be exempted. What are those specified organizations? ESIC, Employees State Insurance Corporation, who will be collecting money from the factories for the purpose of providing insurance to their workers. And EPFO, Employee Provident Fund Organization, will be collected from the employers, the PF contribution and from employees. So that EPFO collecting money is exempted. Like EPFO for workers who are working in the coal mines, we have CMPFO, Coal Mine Provident Fund Organization. Even they collecting the Provident Fund is exempted. Then NCCCD refers to National Center for Cold Chain Development. Basically, they provide the required assistance for setting up the cold chain and for which whatever money that is being collected, so that is exempted. Then Foreign Diplomatic Mission in India. So what is a Foreign Diplomatic Mission? Basically, specified agencies of UN, embassy or consulate. So specified agencies of UN like UNESCO, UNICEF, WHO, etc. So whatever money that is being collected by them, including the embassies and consulates, which will be providing visa services or which will be providing any other kind of assistance to the people. So whatever money that is being collected will be exempted. Basically, this is foreign diplomatic mission located in India. So these are the organizations. Previously we had SEBI, so but now it is not there. So any money collected by SEBI will be taxable or exempted? Taxable. We don't have any exemption. Then any money collected by IRDA, Insurance Regulatory Authority of India. So whether that money collected by them will be taxable or exempted? Taxable. That is not there in the list of these associations. Only these organizations collecting the money from anyone will be exempted. Then charitable and religious services. So there is an entity which is registered under section 12AA or 12AB of Income Tax Act, charitable trust. So these charitable trusts providing some charitable activities, only specified charitable activities, the money collected by them will be exempted. What are those specified charitable activities? Public health. So public health is like providing the healthcare services, but anyhow healthcare services is coming under exemption. So even public health which is done by the charitable trust is also exempted. Number 2, advancement of religion, spirituality and yoga. So all these Babas, Swamijis, ashrams, etc. and all will be coming into this category, and the money collected by them will be exempted. Then educational programs to orphans and physically or mentally traumatized persons, prisoners or persons over 65 years. Remember, persons over 65 years residing in rural area. Suppose if the persons over 65 years residing in urban area, if the educational program is provided to them by the trust, that will be taxable. So if it is orphans, anywhere, physically or mentally traumatized persons, anywhere, prisoners, anywhere, but for these persons over 65 years, that point alone residing in rural area. Then fourth activity is environmental preservation. These are the 4 charitable activities. Apart from this, any other activity may be in the nature of charitable, but we don't have any exemption. Only for these 4 activities exemption is given. Then next, number 2, services by a old age home. So there is a trust or a government which is running a old age home, and they will be providing lodging and boarding services to the people, old people. So who are considered as old people here? Aged 60 years or more are considered as old people. Now from them, money collected from them per month, if it does not exceed 25,000 rupees, then it will be exempted. So if it exceeds 25,000 rupees, entirely it will be taxable. Remember, everywhere in exemptions except incubating services. So if the amount exceeds that limit, entirely it will be taxable. There are many monetary limits that we have come across. So for example here, 25,000. If it exceeds 25,000, entirely it will be taxable. Same way room charges 5,000. If it exceeds 5,000, entirely it will be taxable. Like that, everywhere if the monetary limit is given, if you cross that monetary limit, entirely it will be taxable. The exception is incubating services. In case of incubating services, so whatever money that is collected from the incubator up to 50 lakhs is exempted. If it exceeds 50 lakhs, the excess only will be taxable. So then next one, services by a person by way of conduct of religious ceremony. So basically they will be providing like religious activities. So priest, purohit, etc. will come into this category, and the money collected by them is exempted. Services by specified organizations for religious pilgrimage. So what are considered as religious pilgrimage? Kailash Manas Sarovar Yatra and Hajj Yatra. These 2 are only considered as religious pilgrimage, but not everyone who is providing this religious pilgrimage is exempted. That should be a specified organization. So first, that organization should be specified organization by the government, and they are providing the religious pilgrimage for which they collect some money, that will be exempted. So these are the 4 points related to charitable and religious services. So this is the point I was referring to, incubator and incubating services. So there is an incubator. So who is an incubator? One who owns a laboratory where the research and development will be carried out, and the laboratory is known as incubate, and the one who is developing the research or developing any scientific product is known as incubating. Basically a scientist will be coming under incubating. So example, China is incubator, and Wuhan laboratory where COVID is created is called as incubate, and the scientists who developed that COVID will be coming under incubating. Okay, so now incubator, if they are approved by Government of India, so incubator is basically a owner of the laboratory. Incubator, if they are approved by government, whatever money that is earned by them will be exempted. Whereas incubating is providing services to the incubator. Now whatever money that is collected by the incubating, if it does not exceed 50 lakh rupees in a financial year, then it is exempted, and this exemption is for a period of 3 years, and the condition is that previous year the gross receipt should not exceed 50 lakhs. So which means, for example, year 1 it is 30 lakhs exempted, year 2 60 lakhs, 50 lakhs exempted, remaining 10 lakhs will be taxable. Year 3 we will not get exemption. Why year 3 will not get exemption? Because for year 2 the amount exceeds 50 lakhs. Due to that reason year 3 exemption will not be there. And so suppose year 1, year 2, year 3, every year it is 40 lakhs, 40 lakhs, 40 lakhs, and year 4 whether we will get the exemption? No, because this exemption is only for a period of 3 years from the date of agreement, and therefore thereafter they will not be getting. For example, you see gross receipt of the incubate is 60 lakhs. So first year exemption will be there by default because previous year it is 0. So therefore 50 lakhs, 10 lakhs will be taxable. Second year no exemption. Why second year no exemption? Because the previous year it exceeds 50 lakhs. So second year 40 lakhs, no exemption, as the previous year exceeds 50 lakhs. So 40 lakhs will be the taxable value. Third year 70 lakhs, and whether they will get the exemption for the third year? Yes, because for the previous year, that is second year, amount does not exceed 50 lakhs. So therefore third year they will get the exemption 50 lakhs, but 20 lakhs will be taxable. This is the only place where you cross the limit, so the remaining amount only will be taxable. Apart from this, any other place, if you cross the limit, entirely it will be taxable. Then next, education services. Services provided by an educational institution. To whom? To its students and faculty and staff. 3 people. Education institution providing services to students, faculty and staff. Any amount collected from them will be exempted. So basically, what is an educational institution? So there are 3 categories of educational institutions. So that we have category 1. So see the 4th point first. So services provided by an education institution to students, faculty and staff. Category 1 education institution is up to 12th standard. Category 2 education for obtaining a qualification recognized by law. Category 3 approved vocational education. So schools will come under category 1 education institution. Colleges and professional education will come under category 2. Whereas vocational education, that is skill based, will be coming under category 3 education institution. These 3 education institutions providing services to students, faculty and staff, any amount collected will be exempted. Sir, what about some fees collected from the student? So is exempted, that's fine. But if application fee or prospective fee is collected, he is not at all a student now, he will become student in future. Whether that application fee or prospectus fee is also exempted? Yes. And what if the student is now leaving the college or leaving the school? So we are collecting some money for issuance of transfer certificate or migration certificate. So now he is not a student. Even that fees is also exempted? Yes, because these were related to that particular student only. So therefore CBIC has clarified that this application fee for entrance or fee charged for issuing eligibility certificate or fee collected for issuing migration certificate to the ex-student is also exempted. So that is because of the clarification that is given. Then next one, what if entrance exam fee is collected from the students? They are not at all the students of the education institution. Only after writing the entrance exam they qualify, and then only they will become the student. So now they are prospective students. Whether the entrance exam fee collected from them is exempted? Yes. See the first point. Services provided by education institution by way of conduct of entrance examination against consideration in the form of entrance exam fee is exempted. Now what if there is a body, examination body, National Board of Examination or National Testing Agency? Its role is only to conduct the examination and they will not do any other work. They conduct the exam, entrance exam, and they give the score. Based on that score, these people can join in any college based on counseling. So their job is only to conduct the examination. Will they come under education institution? So for which CBIC gave a clarification stating that yes, so these examination boards are conducting entrance exam. Without entrance exam, the student will not get the qualification. So it is coming under part of obtaining qualification. So these examination boards are also treated as education institution for the limited purpose of conducting the examination, and the fees collected by them is also exempted. So central and state education boards are treated as education institution for the limited purpose of providing service by way of conduct of examination to the students. Therefore, National Board of Examination or National Testing Agency is education institution in so far as it provides service by way of conduct of entrance exam to the students. Then next, services provided to education institution. So see 5th point. So far what we have seen is services provided by education institution. In the 5th point we are seeing services provided to education institution. Only specified activities with respect to service provided to education institution is exempted. So what is that? First, you remember transportation, then catering and security and housekeeping within the premises. The security and housekeeping should be within the premises. It should not be outside the premises. So these four, so transportation of students, faculty and staff, catering, security service within the premises, housekeeping service within the premises. To which category institution? To category 1 institution. Category 1 institution is up to 12th standard. Then this service will be exempted. Remember that this is not service provided by education institution, this service provided to education institution. By education institution always it will be exempted. So for two education institution only, for category 1 it will become exempted. Then next point is admission to or conduct of examination. So bringing any admissions to the education institution for a commission or conduct of examination of that education institution, any amount earned, for all three category institutions, the fees collected will be exempted. So admission to or conduct of examination. Then online periodicals and journals, only for category 2 institution it will be exempted, not for category 1 and 3, because online educational journals and periodicals are not relevant for category 1 and category 3 institutions. So only for category 2 they have given this exemption. Then next we have one circular, CBSE circular in this regard. So there is a Anganwadi school, and that Anganwadi school procures the catering services. So Anganwadi school basically will come under daycare school, and this Anganwadi schools will be part of category 1 education institution. And when they procure the catering service provided to Anganwadi schools is coming under the exemption, because catering services provided to category 1 education institution will be exempted. Accordingly, exemption of GST provided to services provided to an education institution including Anganwadi by way of serving of food including midday meals under any midday meal scheme sponsored by government, irrespective of the funding of such supplies from government grants or corporate donations. So then next one here, suppose if the school is conducting a function, annual day function somewhere in an auditorium, and they receive the security and housekeeping services to that auditorium, whatever money that is paid by that school will be taxable or exempted? Taxable, because security and housekeeping service should be within the premises. Suppose if the school is conducting an annual day function in an auditorium and they receive the catering services, that catering service provided to the school is taxable or exempted? Exempted, because catering can be anywhere, only security and housekeeping should be within the premises. Then next point, you see second point. So first we have seen what are the services provided by education institution. Next we have seen what are the services provided to education institution. Then amount paid to training providers under Deen Dayal Upadhyaya Grameen Kaushal Yojana. Basically this is like a government scheme wherein some volunteers will be going to the rural areas and they will be providing training to the rural youth, and for which they will be getting some money from government. So these government, whatever these volunteers get under Deen Dayal Upadhyaya Grameen Kaushal Yojana, that money collected by them will be exempted. Then any services provided by NSDC, National Skill Development Corporation. National Skill Development Corporation will set up lot of sector skill councils, and below that sector skill councils there will be assessment agent or a training partner. These four people will basically provide lot of skill courses. So for this, whatever money that is being collected will be exempted. So remember four bodies. What are they? National Skill Development Corporation, Sector Skill Council, assessment agent or training partner. Providing any skill course will be exempted. Then next point number 6, services by assessment bodies under skill development initiative scheme. So here there is a skill development initiative scheme wherein people from the industry will be invited by the government to review the curriculum. After reviewing the curriculum, so they will suggest the changes based on which the revised curriculum will be imparted to the students. So these assessment bodies will be collecting some money from the government, so that money collected by them will be exempted. So these are the various activities in relation to education that is exempted. Then, so is the limit for incubate in previous year is up to 50 lakhs or less than 50 lakhs? So it is up to 50 lakhs, does not exceed 50 lakhs. Actually it is less than or equals to 50 lakhs. Less than or equals to 50 lakhs. Okay. Previous year does not exceed 50 lakhs. That's how you need to remember. It's not less than 50 lakhs. Does not exceed 50 lakhs. Does not exceed 50 lakhs. Then look into the next one. Services provided by government. So here already we discussed about services provided by government to business entities. In detail we discussed in that segment 3 RCM, that is 14 specific exemptions we have, 2 general exemptions we have. Apart from that, basically services provided by government is divided into 2. So 4 specified activities which are covered under supply, and all other activities are excluded from supply. What are the 4 activities? Department of Post, transportation of goods or passengers, airport or port services, services to business entities. The services to business entities is already covered above. And Department of Post, in Department of Post following are exempted, that is postcard, inland letter, and envelopes with less than 10 grams is exempted. All other service of Department of Post will be taxable. So what are exempted? Postcard, inland letter, and envelopes weighing less than 10 grams. Not by way of speed post and all. So like book post or registered post, that will only be exempted. But what are the service of Department of Post which will be taxable? Speed post, express parcel post, life insurance services, saving schemes, or other enrollment services. So like agency services, there are many things which the Department of Post will do, that will be taxable. Then transportation of goods or passengers, we have a separate discussion, and airport or port services always will be taxable. Then services provided to government. So far what we have seen is services provided by government, service provided to government, only to government. So pure services will be exempted. Pure services means there won't be any goods element, it will be only service element. That too, it is in relation to function entrusted to government under Article 243G or 243W of the Constitution. As per Constitution, government is required to do certain activities, and for doing that activities, they may outsource that activities to one person. So that person is providing the pure service, labor service. So whatever money that is collected will be exempted. Example, solid waste management. In solid waste management, that is cleaning the garbages, etc., is the work of the government. So they will appoint one person to do this work. So this person will provide only pure services by way of solid waste management. So money collected will be exempted. Then next, what if it involves both goods and services? If the value of goods does not exceed 25% of the total value, then that activity is also exempted. Example, so construction of roads. In construction of roads, goods element is a material that is supplied, and construction is the service element. Definitely in this, the goods element is more than 25%. So therefore this activity will be taxable. Whereas sanitization of streets. In sanitization of streets, so what will happen? The chemicals that is used is only goods element, and sanitization is a service element. The value of goods does not exceed 25% of the total. Therefore it is exempted. But remember, all these activities should be the work which government should do as per Constitution, which they outsource it to some contractors. So services provided by any person to government, central government, state government, union territory, or local authority. Previously government authority and government entity was also there, that is now omitted because for them a separate exemption is being given. Okay, so this is only to government, that is central government, state government, union territory, or local authority with respect to functions entrusted under Article 243G or W of the Constitution. And pure service are exempted. Even composite supply of goods or services where value of goods does not exceed 25% of the total value is also exempted. And government includes Public Works Department also. So Public Works Department, basically PWD. So this PWD will be receiving some services of construction of roads or construction of buildings, etc. So then services provided to them is also exempted. Yes. So here when I say, central government, state government, union territory, local authority, it includes the department of the government also. Not necessarily government as such, all departments of the government is included in that. So that is this amendment. And there is one CBIC circular related to processing of paddy. So there's wheat into wheat flour. So there is like ration shops in north and all, they will be distributing wheat flour to the customers, like people over there. And for that reason, the PDS, public distribution system, ration shops will be procuring the wheat flour. So this wheat flour when they are procuring, so there are two elements. Goods element is wheat, and converting it into wheat flour is a service element. Definitely the value of goods exceeds 25% of the total. So whatever money that is being collected from the government will be taxable. So composite supply of service by way of milling of wheat into wheat flour along with fortification by any person to state government for distribution of such wheat flour under PDS, public distribution system, means ration shops, is not eligible for exemption as the value of goods involved is greater than 25%. So this is the first exemption with respect to service provided to government. Then second exemption. So as this first exemption is removed for government authority and government entity, they have given a new exemption. So this is an amendment for May 24 exam. What is that? Any person who is providing certain services in relation to functions to government authority. Okay, government authority. Because here government authority, government entity, they removed na. That's why separately they have given. But not all activities. Only these 5 activities provided to government authority will be exempted. What are those 5 activities? Water supply. Example, Bengaluru. Right now Bengaluru is facing a water crisis. So people don't have water. And now here what happens? So this government officers or some other places, so here they will be having a corporation or a authority, water supply authority or water supply board. So this water supply board will be providing the water facility. So for that, this water supply board will procure the water. So when they procure the water, they need to pay some charges. That charges which are payable will be exempted. So that is this water supply. Then public health. Public health refers to, like providing any vaccination services or testing services, etc. Then sanitation and conservancy. So sanitation, like so spraying in the streets, then drainages and all, they will spray that chemicals and the gases and all for the mosquito prevention. So that. Then solid waste management is cleaning the garbage, and slum improvement and upgradation, like slum clearance boards, wherein they will be constructing in that slum area, they will make all the huts to be removed, and in one place they will construct one big building for them and they will be shifting them to that place. That is known as slum improvement and upgradation. These activities provided by any person to government authorities exempted. Definitely this will be tested in the forthcoming exam. So what are the 5 activities which are provided to government authorities exempted? Water supply, public health, sanitation conservancy, solid waste management, and slum improvement and upgradation. Then next, any training program for which 75% of the total expenditure is borne by government is also exempted. These also services provided. So what happens here is that, so government will be asking some coaching centers to provide coaching or training to some below poverty line students or economically backward students or minority students, for which the fees will be borne by the government. So if government is bearing 75% or more of the fees, the entire training program is exempted. For example, NEET coaching. NEET coaching to below poverty line students, 1 lakh is the fees, 80,000 rupees borne by government, 20,000 rupees borne by the student. The coaching center gets 1 lakh, 80,000 from government, 20,000 from student. How much is taxable? Entirely exempted, because the training program itself will be exempted. What if government is spending 70,000 and student is paying 30,000? Now what about this? This will be taxable because government is bearing how much? So less than 75%. So due to that reason it will be taxable. The training program will be taxable. Then 4th point, services provided by any institution or NGO under the central scheme of scholarship for students with disabilities. So the difference between 3rd point and 4th point is that the 4th point is basically scholarship for students with disabilities, where entire expenditure borne by the government, then the amount collected will be exempted. Whereas apart from this, any other training program greater than or equals to 75% of the expenditure should be borne by the government. Then next one, renting. In case of renting of movable property, only 4 exemptions we have. That already we have seen in renting of motor vehicles. Hiring a motor vehicle that can carry more than 12 passengers to a state road transport undertaking, and hiring of motor vehicle, electric motor vehicle that can carry 12 passengers to a local authority, hiring of motor vehicle that can carry goods to a GTA, and hiring of bus to a person who in turn provides transportation services to education institution up to 12th standard. So these are the 4 activities in relation to movable property. Renting is exempted. Whereas in case of immovable property, we have for land. So in case of land, here basically this is what renting, including leasing, licensing, etc. So in case of land, upfront charges and annual lease rentals with respect to lease of land by government to government authority or government entity. Remember who is the supplier and who is the recipient. Who is the supplier here? Government is the supplier. Who is the recipient? Government authority or government entity is the recipient. Now they are giving land on lease. What type of land? Is it an agricultural land or industrial land? Any land on lease. What type of lease? Short term lease or long term lease? Any type of lease. They did not tell long term lease, they said lease. and what is exempted, whether upfront charges is exempted or annual lease rental is exempted, everything is exempted. So you need to remember clearly, because it's a very important point that can be tested in forthcoming exams. So what is that? There is a government which is giving the land on lease to whom? Government authority or government entity, for which they will be collecting some upfront amount as well as annual lease rentals. Both are exempted, and the type of lease can be short-term lease or long-term lease, and the type of land can be industrial land or agricultural land, any type of land. Whereas second point you see in case of land, what is the difference between this point and that point? In this case, upfront charges is only exempted, whereas here both upfront charges and annual lease rentals exempted, but here only upfront charges is exempted, including preferential location charges. Preferential location charges is sometimes whenever the land is given next to highways and all, they will be expecting extra charges, that is known as preferential location charges. So upfront charges including preferential location charges with respect to long-term lease. So long-term lease means what? Lease for a period greater than or equals to 30 years. Whereas here they did not tell long-term lease or short-term lease. They said lease. But here it should be long-term lease of what? Industrial plot or plot for development of infra for finance business. Means here they did not tell what type of land, any land. But here they are telling it should be industrial land or land for development of infrastructure for finance business. So by whom? By SIDCO. State Industrial Development Corporation, SIDCO. So State Government Industrial Development Corporation to any person. So here recipient they did not tell to whom. So supplier will be SIDCO, State Industrial Development Corporation. Recipient can be any person. Whereas in the previous case, supplier should be government and recipient is government authority or government entity. Previous point, any type of lease, but here it should be long-term lease. Previous point, upfront charges and annual lease rentals. Here only upfront charges. Previous case, they did not tell what type of land, any land, but here industrial land or land for development of infra for finance business. These are the two exemptions that we have in relation to renting of land or leasing of land. Whereas look into the next point, building. In case of building, so renting of residential property in detail we have seen. So two exemptions we have in case of renting of residential property. What are the two exemptions? Residential property for residential purpose to an unregistered person, or residential property for residential purpose to a registered individual for his family stay. So that is exempted. Then next point, renting of precincts of a religious place meant for general public registered as a trust under income tax. So accommodation, halls and shops. So here with respect to accommodation, if it is per day, so basically it is the precincts of a religious place. Precincts of a religious place means what? The surroundings of a religious place which is given on rent. For what purpose it is given on rent? It can be given on rent for accommodation or hall or shop. But remember that religious place should be registered as a trust, either a charitable trust or a religious trust. So either a charitable trust under 12A, 12AB or religious trust under 1023C or 1023D. So it can be any trust. So they own the premises. So the precincts means surroundings of the religious place. That religious place should be religious place for general public. Means it should be like a temple or a church or mosque or gurudwara, etc. Like that, it should be a religious place meant for general public. For what purpose it is being given on rent? For accommodation or for conducting any functions, hall or for shops. If it is for accommodation, per day if it is less than 1000 rupees is exempted. What if it exceeds 1000 rupees or equal to 1000 rupees? Entirely it will be taxable. Remember, only less than 1000 is exempted, not less than or equals to 1000 is exempted. Only less than 1000 is exempted, that to 1000 rupees, less than 1000 rupees per day. You can remember it like 999. You can remember it like 999 is exempted. 1000 rupees will become taxable. Okay. Then next, halls. For hall also it is exempted. So how much it should be per day? It should be less than 10,000, means 9,999. Up to this means it will be exempted. So equals to 10,000 rupees also will be taxable. And shops also 9,999, less than 10,000 rupees, but it is per month, not per day. So this is per day and this also per day, whereas this is per month. Then it will be exempted. If it exceeds these limits, entirely it will be taxable. Then sports related services. sports related services we have, so two exemptions. One is sponsorship services to a recognized sports body is exempted. What is a recognized sports body? There are 6 sports bodies which are considered as recognized sports bodies. National Sports Federation, so BCCI, Indian Hockey Federation, etc. will come under National Sports Federation. Inter-University Sports Board, which will conduct the games between the universities. Then Paralympic Committee, for the physically challenged people, they will be conducting games and sports. Then Indian Olympic Association. So then Central Civil Services Cultural and Sports Board. So government, for government employees, they will be conducting sports. Then Panchayat Sports Board. So for people in the villages, some matches like kabaddi or volleyball or this boat racing, etc. they will be conducting. So these are the recognized sports bodies. That is National Sports Federation, Inter-University Sports Board, Paralympic Committee, Indian Olympic Association, Central Civil Services Cultural and Sports Board, and Panchayat Sports Board. Okay. And if they receive any sponsorship money, that money received by them will be exempted. Suppose if there is a sports body which is not a recognized sports body, the sponsorship money collected by them will be taxable. Then who will pay GST in that case? If the recipient is body corporate or firm, it will be coming under RCM. If the recipient is other than body corporate or firm, it will be coming under FCM. Correct? So see this. Recognized sports body example BCCI and unrecognized sports body example IPL. Now BCCI is getting some money from body corporate, so that is exempted. Even BCCI getting money from a sole proprietor, that is also exempted. Whereas if IPL is getting some money from a body corporate or firm, for example Tata, and that will be taxable. But who will pay GST in this case? RCM. That body corporate or firm only will be paying. Suppose if they get sponsorship money from an individual, sole proprietor, then also it will be taxable. But who will pay GST? FCM. So IPL board only will be paying GST. Then second exemption is services provided by individual as a player, referee, umpire, coach or team manager to a recognized sports body is exempted. Only 5 people: player, referee, umpire, coach and team manager to recognized sports body exempted. If it is others, to recognize sports body also it will be taxable. Who are others? Like curators, selectors, technical experts, commentators, etc. And all these people providing services to unrecognized sports body will be always taxable. We don't have any exemption. So the exemption is what? Services provided by individual as a player, referee, umpire, coach, team manager to recognized sports body is exempted. Then one more exemption is also there. Services provided by one recognized sports body to another recognized sports body. Say Inter-University Sports Board is conducting a cricket tournament for which they asked BCCI to support. Now BCCI is providing the service to Inter-University Sports Board, one recognized sports body to another recognized sports body. So the fees collected by them will be exempted. Then next one, services by an unincorporated body or a non-profit entity to its members. So following are exempted. So there is an unincorporated association or a body, they are providing services to their members and the money collected from them will become supply under 71AA. So any activity between a person other than individual and its members, so it will become supply under 71AA. But these activities are exempted. Suppose if the association is a trade union, so group of traders, they form an association and the members will be the traders for which they will be pay membership fees, whatever may be the membership fees, that is exempted. Suppose if the service itself is exempted, so there is an association which is providing vaccination to its members. Generally vaccination is exempted. Even if it is provided by association to its members also, it will be exempted. Then resident welfare association, apartment owners association, they will be providing lot of maintenance services for which they collect the maintenance charges, that will be exempted, provided how much should be the maintenance charges? Does not exceed 7,500 rupees per month per member. If it exceeds 7,500 rupees per month per member, entirely it will be taxable. Suppose if it is as an industrial or agricultural labor association, so industrial or agricultural labor association will be providing services to their members who are nothing but the industrial labor or agricultural labor by way of collecting some membership fees from them. Whatever may be the membership fees, that is exempted. So then apart from this, it is any other entity for promotion of trade, commerce and industry. So any other industry. So like it's like some associations like CIA, Confederation of Indian Industry, or FICCI, like that. Say there are some associations which are mainly established for the purpose of promotion of trade, commerce and industry. If they are collecting some membership fees, how much should be that membership fees? If it is less than or equals to 1000 rupees per annum, not per month, per annum, then it will be exempted. Otherwise, it will be entirely taxable. Up to an amount of 1000 rupees per month, sorry, not per month, per member, per annum. Whereas the 7500 rupees is 7000 rupees per member per month. Then next, there is one amendment in this case. So very important amendment. So please concentrate. That is electricity charges. Usually electricity charges will be incurred by the association and it will be collected from the members. How it will be collected from the members? Whether the bill is in the name of the member, which is paid by the association and recovered from the member. If that be the case, then the association is acting as a pure agent. So that electricity charges collected by the association should not be included in the value for computing the monthly maintenance charges. Again I am repeating, please concentrate. There is an association which is incurring some electricity charges. This electricity charges bill they are paying and recovering it from the members. Now in this case, so whether the bill is in the name of the members, yes, bill is in the name of members, means their flat EB bill who pay, association pay and recovering it from the flat owner. Now in this case, they are acting as a pure agent. Liability of the recipient incurred by supplier as a pure agent of the recipient while computing the maintenance charges, monthly maintenance charges, whether these EB charges recovered will be included or not to be included, not to be included. So electricity supplied by malls, airport operators, real estate owner or real estate developer or resident welfare association pay the electricity charges on behalf of the members and claims reimbursement of actual electricity charges, then it will become pure agent, correct? That's the first point I discussed to you. So pays electricity charges on behalf of members and claims reimbursement of actual electricity charges. So it will not form part of value. So that's clear. Whereas second point you see, collects from members on actual basis for electricity as charged by the state electricity board. Sir, what is the difference between previous point, this point? In the previous point, the bill was in the name of the member and the association has paid it and recovered it from the member. But in this case, second point, the bill is in the name of the association for the common area and that they are recovering it from the members on actual basis. Actual basis means what? If the bill is 2000, how much they should recover it from the members together? 2000. Then in that case, they are deemed as pure agent. This is a deeming fiction created in the circular. Deemed as pure agent, so the 2000 rupees need not be included. Got it? Suppose if the bill is 2000 and by way of apportionment, if they recover some 2200 rupees extra. Why extra? Because they will have some, they have to go to EB office and pay bill, etc. So some extra amount they recovered. Now in this case, they are not acting as pure agent and therefore the entire amount recovered will be included in the value. If they collect charges from members on ad hoc basis, which sometimes exceeds the actual electricity charges of electricity board, so then it shall form part of the value entirely. So mainly this will be useful for computing the monthly maintenance charges. Okay. So for example, say this. Anyhow, the regular maintenance charges is 5000 rupees per month. Okay, 5000 rupees per month. Now, what happens is that there is some common EB charges. So common EB is somewhere like 65,000 rupees. Okay, that's a big complex. Okay, and this 65,000 on actual basis they recovered. So say there are around some 50 flats. There are around some 50 flats. 65,000 divided by 50. How much? 65,000 divided by 50. 1,300. Then specific EB for each and every flat. For this flat, this is common EB. Then specific EB, specific electricity board charges, specific electricity charges, that is 4,000 rupees per month. Now if you do the total exceeds 7,500, but you should not take 4,000, you should not take 1,300. So therefore, what is the maintenance charges? 5,000. It does not exceed 7,500. Therefore, it will be exempted. Okay. Now, what they are doing, rather than recovering it on actual basis, so instead of 1,300, they are recovering 1,500 per month. Okay. And this is say 7,000 per month and 1,500 per month. Now, common EB, they did not recover on actual basis. So, whether it will be included in the value? Yes, it will be included in the value. So, 7,000 plus 1,500 will be 8,500 per month, which is more than 7,500. Therefore, it will be taxable. You got it? So, therefore, this recovery of EB charges is going to impact the monthly maintenance charges. So, if the monthly maintenance charges exceed 7,500, entirely it will be taxable. So, that's why what EB charges should be included, what EB charges should not be included, they gave a clarification. You tell me which EB charges should be included? On ad hoc basis, if they are recovering an amount which is in excess of the actual EB charges, then in that case it should be included in the value. What if the actual EB charges is only recovered? It will not be included. What if the specific electricity charges of that flat which the association pays and recovers from the flat, that will also not be included. So definitely this point will be tested in the forthcoming exam because of the amendment. Then, so in case of resident welfare association, collection amount exceeding 7,500 per month per member, then entire amount will be taxable. But also remember, they should be crossing the threshold limit. Why they should be crossing the threshold limit? Let's take, there are only 10 flats. There are only 10 flats. And each flat, they will pay 10,000. So monthly it exceeds 7,500 rupees, like a gated community. So gated community wherein all facilities they are providing. So definitely it will be 10,000 rupees also. Into 12. If you see how much is the total turnover, so 10 flats into 10,000 into 12, that will be 12 lakhs. 12 lakhs does not exceed 20 lakhs. So therefore, they are not required to register and pay any GST. So just because you see 10,000 taxable, don't conclude to computation of GST liability. Also check how many really number of flats and for how many months they are collecting the maintenance charges. The total should exceed 20 lakhs. Then only they will pay GST, because taxable or exempted is for determining liability. But thereafter you need to check as to whether they are liable to get registered or not. Then next area is transportation of passengers. So there is one query. Sir, this exemption of resident welfare association is 7,500 per month per flat per member, right? Because a member may have 3 to 4 flats also. Yes, here per member refers to per flat. Suppose if one person, not per person may have 3 flats, means he will be having 3 memberships. So per member here refers to per flat. Okay. Transportation of passengers following are exempted. That is in case of railways. First we are discussing transportation of passengers. In case of railways, we have 2 exemptions. That is, other than first class or AC, everything is exempted. What are other than first class or AC? Sleeper class or general tickets or second class sitting, that will be exempted. If it is first class, AC or non-AC, taxable. If it is any AC compartment, it will be taxable. Remaining cases, it will be exempted. Then metro, mono and tramway, whatever may be the case, it will be exempted. So definitely it will be AC only. Metro rail, monorail and tramway, that will be always exempted. Then when it comes to airways, in case of airways, so there are 2 exemptions. Number 1, if the starting point of the passenger or ending point of the passenger is in northeastern states or Bagdogra in West Bengal, so then it will be exempted. So what are considered as northeastern states? MMTN, ASAM. So MMTN, USAM, like that we discussed for composition scheme. So that U is Uttarakhand. Here it is not MMTN, USAM, it is MMTN, ASAM. A for Assam. So Manipur, Mizoram, Tripura, Nagaland, Assam, Sikkim, Arunachal Pradesh and Meghalaya. So if the starting point or ending point of the passenger is in these places or Bagdogra and West Bengal, that entire air ticket will be exempted. But remember, it should be in the economy class. Suppose if it is in business class, that will be taxable. The next one, consideration received from government towards viability gap funding for a period of 3 years. So in case of regional connectivity airport scheme, that is UDAN scheme, so government will be paying some amount to the airlines, so as a revenue gap. So some amount they will collect from the passenger, some amount they will collect it from the government. That amount which is collected from the government is exempted for a period of 3 years. After 3 years also government will pay money to the airlines, yes, after 3 years also they will pay, but that amount will be taxable. Only for 3 years that too money received from government is exempted. Then next, when it comes to waterways, in case of waterways, we have two exemptions. First, inland waters is exempted. Transportation of passengers by inland waterways is exempted. Inland waterways means what? River. Then, suppose if it is coastal waters means seaways, but it should be within India. Other than for tourism purposes. Other than for tourism purpose means like public transportation. So say Chennai to Andaman. So in Andaman also India, Chennai also India, but the waters will be coastal waters. It is not for tourism purpose. Other than for tourism purpose, therefore it will be coming under exemption. Suppose if it is for tourism purpose, then it will be taxable. So whether it is a government operated or private operated vehicle. So that ferry can be government ferry or a private ferry. So if they are transporting general public, then it will be exempted. If it is predominantly for tourism purpose, then it will be taxable. Then when it comes to roadways, in case of roadways, we have three exemptions. First, non-AC stage carriage. Stage carriage refers to a vehicle which stops at every stage during its journey is known as a stage carriage. If it is a non-AC stage carriage, then it will be exempted. Suppose if it is non-AC contract carriage other than for tourism or hire, that is also exempted. So non-AC stage carriage exempted, no conditions. Non-AC contract carriage other than tourism or hire. What if it is a non-AC contract carriage for tourism or hire? Then it will be taxable. And then metered cab or auto rickshaws is also exempted. But there is one important point here. If these three are through e-commerce operator, entirely it will be taxable. Exemption not available if the services are provided through e-commerce operator. Okay. So basically auto is exempted. But if the auto is through Ola or Uber, then the money collected will be taxable. That is about this. Then next, transportation of goods following are exempted. Transportation of goods by railways, specified goods will be exempted. So transportation of goods by railways, what are those specified goods? Whatever specified goods that we have seen for GTA, the same list of specified goods. So what are they? That is agricultural produce, organic manure, food grains including flours, pulses, milk and salt, newspapers and magazines, relief material for natural and man-made disasters, and defense and military equipment. Same list of goods. And in case of airways, from outside India to India, transportation of goods by airways from outside India to India. What about India to outside India? That is not exempted, that will be taxable. Only outside India to India is exempted. Then when it comes to transportation of goods by waterways, inland waterways, transportation of goods exempted. So inland waters, both transportation of goods as well as transportation of passengers is exempted. Whereas in case of coastal waters within India, what is exempted? Specified goods. Again the same list of specified goods. So these three places, transportation of specified goods is exempted. What are the three places? Railways, then waterways, coastal waters. Coastal waters within India, and then GTA. These three places, and the list of specified goods will be same in all these three places. Then when it comes to roadways, other than GTA or courier agency, all other transportation of goods by roadways will be exempted. So GTA basically is goods transport agency, means any person engaged in transportation of goods by whatever name called, they give a document. So they should give a document. The document will be called as consignment note. Even sometimes the document will be called as BILT, B-I-L-L-T-Y, BILT, like that. You just Google it, you will be able to get it. So BILT, like that they will call. So which means it is like a consignment note. Okay. So then it will be called as a GTA. And the next one, courier agency. So these two people are only taxable. So all other people like normal Tata Ace or truck and all, they will be operating na, whatever charges that they collect will be exempted. Then previously, transportation of goods by waterways from outside India to India, like that and all, we had some exemption. Now everything will be taxable in case of international waterways. Transportation of goods by waterways from outside India to India is taxable. Even transportation of goods by airways and waterways from India to outside India is also taxable. Then GTA services, we already know that there are 3 exemptions in case of GTA. Specified goods, recipient is government, so registered only to deduct TDS, and recipient is individual HF or AJP, all are unregistered and not having factory. And basically GTA is a person engaged in transportation of goods by road and issues a consignment note by whatever name called. And what are these specified goods? Already we have seen. And in case of GTA, what are the rates that are applicable? So either FCM, so that is FCM again 12% or 5% without ITC, and or RCM 5%. They can select an option during a financial year. Such option when they need to select between 1st January to 31st March of the previous year, and option 1 selected remains till the subsequent selection is made. Then next, this is a very important circular. So there are 3 different circulars which are given related to what is renting of motor vehicles, what is contract carriage on hire, etc. So merging that, I have just given this chart. So please concentrate. There is a owner of a vehicle who is providing services to the person requiring the vehicle for transportation. But in which vehicle? Non-AC vehicle. Non-AC vehicle. Okay. Now, whether this vehicle is operated in a predetermined routes based on predetermined schedule. Yes. What does that mean? Like you are one company. You wanted me to pick your employees and drop in the office. Again, evening, pick the employees from the office and drop in the respective places. Means the route is predetermined. The schedule is predetermined, correct? Now monthly I will be collecting some amount. Now this will not be called as renting of motor vehicles. This will be called as contract carriage other than tourism or hire. Other than tourism or hire. So consequently it will be taxable or exempted? Exempted. What if it is AC? Because just now we saw non-AC contract carriage is exempted, correct? Non-AC contract carriage other than tourism or hire is exempted. So therefore, this is a non-AC contract carriage other than tourism or hire, therefore it is exempted. What if it is a AC contract carriage? AC contract carriage always taxable. Got it? Then suppose if the vehicle is at the disposal of the recipient, means I am giving the vehicle to you. The vehicle is at your disposal. You are only having that vehicle. Okay. Now in this case, for the period, you are only having the vehicle. For a period of time or for a particular voyage or journey, that you check. Is it for a period of time, month or 6 months or 1 year, like that, or is it for a particular voyage? So you are taking, your employees or your people on a vacation. So now for the completion of the vacation, the vehicle will be with you only, correct? If it is for a particular voyage or a journey, then also it will be called as contract carriage, but this will be called as contract carriage for tourism or hire. Got it? Therefore, it will be coming under taxable. Why, sir, it will be taxable? Because non-AC for tourism or hire will be taxable. Other than tourism or hire is only exempted. Therefore, it will be taxable. And why FCM? Contract carriage, we don't have RCM. In the list of RCM, we don't have contract carriage. Suppose if the vehicle is at the disposal of the recipient for a period of time, if it is at the disposal of the recipient, then what it will be treated as? It will be treated as renting of motor vehicles. So then renting of motor vehicles will be taxable. Whatever exemption that we have for motor vehicles is not applicable here. What are the exemptions we have for motor vehicles? So a motor vehicle more than 12 passengers to state road transport undertaking, electric motor vehicle to local authority and GTA and education institution school, but it is not covered there. Therefore, it will be taxable. Wherever renting a motor vehicle is taxable, again we have three conditions. What are the three conditions? Supplier should be other than body corporate, recipient should be body corporate, rate of GST 5%, then it will be RCM. Other cases it will be FCM. So this circular mainly identifies the difference between contract carriage means what, renting a motor vehicle means what. Definitely this will be tested here. Very, very important. So there is a chance of asking questions on this. Then there is one query, sir, in case of electricity amount collected along with rent and such EB is on actual basis, then EB will be exempted by business entity registered. No, see, basically you should remember one thing. When my expenditure is exempted, when I recover that expenditure from you, not that the expenditure will also become exempted. Example, toll charges is exempted. Concentrate. This is the mistake what everyone will do this. Toll charges is exempted. I am a transporter. I incur the toll charges. Toll charges exempted. When I recover the toll charges from you, the name of this charges is not toll charges. The name of this charges is transportation service. So this expenditure will be part and parcel of my transportation charges. Are you getting this? I am not providing the toll to you. I am not collecting the toll charges from you. I already paid toll charges. When I recover these expenses, the character of these expenses is the character of the main activity. You understood? Same way, electricity charges I am paying as association. So electricity charges is exempted. There is no GST on electricity. But the moment that electricity charges is recovered from you, the nature of this, I am not providing electricity, boss, to you. I am not providing electricity. Electricity is provided by some other person. I paid for that. That is exempted. When I recover it from you, the name of it is not electricity charges. Then what is it? Maintenance charges. In that electricity charges will be added. You understood? So don't tell electricity charges as exempted because I am not giving electricity. I did not create a solar power plant and I am not supplying electricity to you. If I am doing that, then it is exempted. You got it? So here that is not the case. So when my expenditure is exempted, the moment I am recovering that expenditure from you, don't add the character of the exemption to the expenditure. This expenditure character will change now. Simple here, when a girl gets married, her house name will change or not? Yes or no? Correct. Surname will change na? Like that. So here the expenditure was called as electricity. But the moment we are recovering, the name will change. What is the name of it? Maintenance charges. You got it? Like that. Then, and don't take this example in wrong sense and all. So feminism, Jindabad, okay. Say this. So import of services. So the next aspect is import of services. Import of services is divided into two. OIDR service other than OIDR service. Already we made a discussion related to this. OIDR service always taxable. Who will pay GST in case of OIDR service? If it is imported by non-taxable online recipient, it will be taxable under FCM. If it is imported by other than non-taxable online recipient, it will be taxable under RCM. OIDR service always taxable. It's only the matter of who will pay GST, FCM or RCM. If imported by NTOR, it will be FCM. If imported by other than NTOR, it will be RCM. Whereas other than OIDR service, we have one exemption. If it is imported by NTR, then it will be exempted. If it is imported by other than NTR, then it will be taxable under RCM. So So what is the meaning of OIDR service? Basically a service which is mediated through internet over information technology. It is called as OIDR services. So online information database or retrieval services means service whose delivery is mediated by information technology over internet, and the nature of which renders their supply impossible to ensure in the absence of information technology, and includes electronic services such as, so they are telling includes electronic services such as advertising over the internet. Example, Instagram, YouTube will come under OIDR services. Providing cloud services like QuickBooks, SAP HANA, these are examples of cloud services. Then provision of e-books, movie, music, software and other intangibles, Kindle, Spotify, Apple Music, these are all examples. Then providing data or information retrieval or otherwise to any person in electronic form through a computer network. Udemy, so there will be some courses which you will enroll, and Canva, so Canva for designing purpose you can access. Again it is working on cloud, so it's a OIDR service. Online supplies of digital content, movies, television shows, etc. Example, Netflix, Amazon Prime, OTT platforms. Digital data storage, example, iCloud, Google Drive, etc. Then online gaming also, yes, Minecraft, it will work on server. So then GTA Vice City, same. Excluding online money gaming. So OIDR service excludes online money gaming. Why? Because online money gaming will come under specified actionable claims. Then non-taxable recipient means already we know. Who is non-taxable recipient? Any unregistered individual importing for personal purpose, or a charitable trust importing for charitable activities, or government importing for other than business or commerce. Who is non-taxable online recipient? Any unregistered person or a registered person who is registered only to deduct TDS. Then next one, construction services. So in construction services, first point, construction of an individual house. So you are constructing an individual house, whatever may be the floor area, whatever may be the consideration, the money received by me as a contractor will be exempted irrespective of the floor area. What is called as individual house? House occupied by individual, single family is called as individual house. For example, Antilla, like that one big house is there in Mumbai. So Mukesh Ambani's house, and now that is called as an individual house, surprisingly. Why it is called as individual house? Because it is occupied by one family. So it will be called as an individual house. And whatever money that is being collected for construction of that house will be exempted. But it should be a pure labor contract. Means what? It should not be works contract. It should be a pure labor contract. We should not buy the material as a contractor. So all the material required for construction they should buy. We should only do the construction services. Then it will be exempted. Then construction, repair, alteration, renovation, etc. of following projects is exempted. Again it should be pure labor contract and not works contract. That is Housing for All Mission and Pradhan Mantri Awas Yojana. What is the difference between first point and second point? In the first point only construction is exempted, but in the second case both construction and repair is exempted. In the first case it should be construction of individual house. In the second case it will be construction or repair of government projects, that is Pradhan Mantri Awas Yojana and Housing for All Mission. Then third point, so that is 1/3 will be reduced towards UDS. Already I told you while discussing 7.5%, 1.5% whenever we are selling the flat, and that flat includes the undivided share of land, we will exclude the undivided share of land. How we will exclude? 1/3 of the gross amount is always treated towards the UDS. For example, if the flat is 75 lakhs and 25 lakhs will be excluded towards UDS and remaining 50 lakhs only will be taxable. Then, but this is applicable only in case of residential units only, and even for commercial units it will be yes, provided they are charging some amount towards the land. Wherever they are charging some amount towards the land, this will be constant. So for residential as well as commercial, but they should be charging some amount towards the undivided share of land. Then next one, transfer of development rights. So TDR, FSI and long-term lease, proportionate exemption we have seen. What is that proportionate exemption? Value of inward supply of TDR, FSI and long-term lease into 18% into carpet area of the residential units booked before completion certificate of first occupation, whichever is earlier, divided by total carpet area of the project. For example, you see this. Value of inward supply of TDR, FSI is 10 lakhs, excluding GST 18%. So therefore, GST payable on inward supply is 10 lakhs into 18%, 1,80,000. Floor area of the residential units booked before completion certificate is 28,000 square feet. And total floor area of the project is 50,000 square feet. So how much will be exempted? 1,80,000 into 28 divided by 50. So therefore 1,800,000 will be exempted. So remaining will be taxable. What is it remaining? 1,80,000 minus 1,800,000, 79,200 will be taxable. Then next, advocate services already we have seen. So in case of advocate services, individual advocate and firm of advocates, we have total 4 exemptions. What is that? If they are providing services to a person other than business entity, that is exempted. If they are providing service to another individual advocate or firm of advocate, it is exempted. If they are providing services to central government, state government, local authority or government authority, it is exempted. And if they are providing services to a business entity whose turnover during the previous year does not exceed threshold limit, it is exempted. But in these 4 points, which point? Service provided to individual advocate or firm of advocate is not applicable to a senior advocate. In that case, who should be taken as the recipient? The ultimate litigant or applicant or petitioner should be taken as the recipient. So see the next page. For senior advocate and arbitrator service, we have only 3 exemptions. If they are providing services to a person other than business entity, it is exempted. If they are providing service to government, it is exempted. If they are providing services to a person, business entity whose turnover during previous year does not exceed threshold limit, is exempted. And service provided by senior advocate to individual advocate or firm of advocate is not exempted. In that case, who will be taken as the recipient? Ultimate litigant, applicant or petitioner shall be deemed to be recipient, and accordingly we need to interpret. And one more point is also there. Section 23 overrides section 24. So as advocates outward supply is fully covered under RCM, so they are exempted from registration. And if they have some inward supplies on which they need to pay GST under RCM, they are not required to pay GST because section 23 overrides section 24. These points already I have seen before, I am just giving it. Then next we have exemptions under IGST Act. So in these exemptions under IGST Act, 4 exemptions are there. Number 1, if both supplier of service and recipient of service located outside India, all services are exempted. Previously one service was there, transportation of goods by vessel from outside India to India. The importer of such goods is required to pay GST, like that one point was there. And because of the Supreme Court judgment in Mohit Minerals case, that particular exemption, that particular taxability got removed, which means now you remember, after amendment you remember what is that? Supplier of service outside India, recipient of service outside India. There is no GST on that. All services will be exempted. Then number 2, services provided by an Indian tour operator. So that Indian tour operator is providing tour operator service to whom? To a foreign tourist, where the tour is conducted fully outside India. Now whatever money that is collected will be exempted. So Indian tour operator to a foreign tourist in relation to tour conducted wholly outside India. Why won't it become export of service? Tour operator will be called as intermediary. In case of intermediary service, as the place of supply is location of supplier. As the place of supply is location of supplier, that is India, it will not become export of service. But basically these services are provided to foreign tourists, which means foreign exchange will be coming to India. Due to that reason, they have given exemption separately. So what is the exemption? Indian tour operator providing tour operator service to a foreign tourist in relation to the tour conducted wholly outside India. What if the tour is conducted in India? Then entirely it will be taxable. What if the tour is partly in India, partly outside India? That is the next point. Then proportionate to the number of days the tour conducted outside India, it will be exempted. Services provided by tour operator to a foreign tourist in relation to tour conducted partly in India, partly outside India. Exemption is with respect to that part of the tour which is conducted outside India. And how to compute that? Total consideration into number of days the tour is outside India divided by total number of days. For example, 1 lakh is the consideration. Number of days tour conducted outside India is 6. Out of the total number of days of 10 days. Now 1 lakh into 6 by 10, that is 60,000. Or 50% of the total consideration, whichever is lower is only exempted. So the exemption, maximum exemption is only 50%. So therefore total consideration into 50%, whichever is lower will be taken. Suppose number of days the tour conducted outside India is 4 days. So 1 lakh into 4 by 10, 40,000. 40,000 or 50,000, whichever is lower, 40,000 is only exempted. Now suppose while calculating the number of days, suppose if the time spent outside India is more than or equals to 12 hours, you count it as full day. For example, 3 days, 9 hours will be counted as 3.5 days. If it is less than 12 hours, it will be considered as half day. So therefore 3 days, 8 hours considered as 3.5 days. 3 days, 16 hours will be considered as 4 days. Then fourth point, services provided by an intermediary where location of both supplier and recipient of goods is outside India. So what is this fourth point? There is a seller of goods outside India, buyer of goods outside India. You are an intermediary, a commission agent who is located in India, connecting this seller and buyer outside India. As you are acting as a commission agent, you will be receiving some commission. That commission will be exempted. Again, why we call it as exemption? Why won't it become export of service? Again, the same story, intermediary services. The place of supply will be location of supplier. Where the intermediary is located, India, then it will not become export of service. But as you provide the services to people outside India, so it will be bringing foreign exchange currency. Due to that reason, they have given this exemption. Okay. So what is this fourth point here? Intermediary located in India, connecting seller outside India, buyer outside India, for which you get a commission. That commission will be exempted. Now, what is the difference between first point and the last point? In the first point, supplier of service outside India, recipient of service outside India, the entire activity is exempted. Fourth point is seller of goods outside India, buyer of goods outside India. We are not talking about the goods here. We are talking about the intermediary service who is in India. That intermediary service is exempted. The next, miscellaneous exempted services, transfer of going concern as a whole or independent part thereof. Example, slump sale or entire sale of business as lock, stock, barrel, or transfer of business. No need to pay GST on the sale consideration. Then supply of service associated with transit cargo to Nepal and Bhutan. So Nepal and Bhutan are landlocked countries. Any goods which are to be imported to Nepal and Bhutan will be imported into India because of the MOU that India is having with Nepal and Bhutan, and thereafter the goods will be taken from India to Nepal and Bhutan. And for this movement of goods, if you provide any services, so transit cargo services like loading, unloading, transportation service to these goods, the money received will be exempted. So that is the supply of service associated with transit cargo to Nepal and Bhutan. Both to and from covered in the exemption as per CBIC circular. And if the cargo container returns empty, that is, you are collecting money not only for taking the vehicle, but also returning empty, for that also you will collect some charges. Even that charges is also exempted. Suppose while returning, if you carry the goods and for that if you collect some charges, that charges will be taxable. That charges is not exempted. Only going from India to outside India, that Nepal and Bhutan is exempted, and return empty it will come. For that you will collect some charges, that is exempted. But while returning, when they load some goods and they are bringing it, for that you collect some charges, that charges will be taxable, that is not exempted. Then service by way of collecting or providing news by independent journalists. Independent journalists will be working with any newspaper or news channel, so they will be getting money from the newspapers or news channel. They will not be associated permanently. They are not like employees, they are like freelancers. That money earned by independent journalists will be exempted. Same way, money earned by PTI and UNI. PTI and UNI are news broadcasting agencies. So these people will collect the news and they will be disseminating the news to the newspapers and news channels. So these people will collect money. So for example, you want to give some news and that should come in all the newspapers. Go to PTI or UNI, you pay some money to them. It is like a press club. So they will be releasing the news to all the newspapers and news channels. So the money collected by them will be exempted. Then service of public libraries by way of lending of books. So there are a lot of public libraries. So wherein public library means it is accessible to general public. Any person can go to that library, and if they are providing books on rental basis and for which they collect some lending charges, that lending charge is exempted. What if it is a private library? If it is a private library, then the money collected will be taxable. What if the private library is operated by an educational institution? Then in that case, it will be coming under educational institution exemption. Services provided by educational institution to its students, faculty and stuff, there it will be coming. Then services by an organizer. There is an organizer who is organizing a business exhibition, where the business exhibition is held outside India. I am organizing a business exhibition. You are my recipient. You are in India, I am also in India. But where the exhibition is held outside India, it will indirectly encourage exports. Due to that reason, this service, exhibition service, is exempted. What if the exhibition is held in India? We don't have any exemption with respect to that. Then number 6, services by way of public conveniences such as provision of facilities of bathroom, washroom, lavatories, urinal or toilet. So for this public toilets, 1 rupee, 2 rupees collected na, and now 5 rupees they are collecting. So that is also exempted. No GST on that. Service by way of accessing to road or bridge on payment of toll charges. This is what I told you. Toll charges are basically exempted. There is no GST on the toll charges other than by way of annuity. So toll charges is nothing but recovery of expenses. So they will invest in laying down the road and they will recover it from the people who are using that road. But there is toll charges by way of annuity. So when the government is using that road, so they will be paying annually some charges to this person, builder. So that annuity previously was exempted and now they have removed it. So therefore toll charges by way of annuity is taxable. Then overloading charges at toll plazas is also exempted. Sometimes what will happen, big vehicles and all will go in the toll gates. So for which there will be some extra charges collected, overloading charges. That overloading charges is also exempted. Then higher toll charges because of not having a functional FASTag. FASTag would have been expired or there is no balance in the FASTag. Then in that case, what will happen? So we have to pay by cash. When we pay by cash, they will be collecting double charges. So the double charges is also toll charges only, that is also exempted. Then services by performance artist. There is a performance artist. Who is a performance artist? One who performs before the audience is known as performance artist. In folk or classical art form of music or dance or theatre, where the amount charged is up to 1,50,000. So in what genre they need to do? Either in folk or classical. And what is the art form? Either music, dance or theatre. Theatre means stage shows. Okay. And how much should be the consideration per performance? It should not exceed 1,50,000. However, if they are acting as a brand ambassador, even if the amount does not exceed 1,50,000 entirely, it will be taxable. Then services by way of training or coaching in recreational activities relating to arts. Arts or culture should be by an individual. So there is a arts training center or a culture training center like some martial arts or dance or kung fu, etc. and all, or culture like imparting Vedas, Upanishads or any language, it should be by an individual, then only it will be exempted. If it is sports coaching centers, that sports coaching center should be registered as a trust. The sports academy should be registered as a charitable trust, then the money collected by them will be exempted. Then satellite launch services supplied by any person. Any person, previously they have given, so this is also an amendment. Previously they have given Anthrics Corporation, ISRO and New Space India Limited like that. But now it can be any person, mainly because they wanted to attract this Elon Musk into India to bring his SpaceX business here, so that some revenue will be generated for Indian government. So that's why they are telling satellite launch service provided by any person. So it can be private or anyone, that will be exempted. Then these are the various exemptions that we have with respect to GST. And so we have completed this. Look into time of supply also we have completed. We'll take a break and then we will start with place of supply. Okay. Meanwhile, on exemptions, if you have any doubts, online students, just post it. I'll explain after break. Okay. We'll start. So related to exemptions, there are 3 queries. Any services provided to government entity will be taxable. No, it's not taxable. There are 5 activities we saw now that is exempted, and remaining activities will be taxable. That water supply, public health, sanitation conservancy. So that is applicable for government authority. Government authority includes government entity also. So that is exempted, and remaining activities, anything will be taxable. And next one, in RTP for May 24, question number 6, rent paid to residential dwelling taken for running an office for providing DSA services. Okay, owner unregistered. In answer, they have considered this under RCM, but it is FCM, right, sir? That's what I said in the last class also. There is a confusion right now that renting of residential property for commercial purpose, whether it is FCM or RCM, there is a confusion. So yesterday I gave you one table. So in that I said that, so it is FCM because it should not be RCM. So maybe it is a mistake in the RTP, but I will check that once. Anyhow, I will post one video on RTP discussion in this YouTube channel that you can refer. Okay. Then, and some more students have requested me to do MCQ marathon as well. Yes, that is also I am planning. So but that I am planning in April first week like that. So reason being, I want to complete this revision mighty 50 first, and then I will do that. Okay, I will let you know, I will inform you, so that we can do it like online live itself, MCQ marathon. Some 100 MCQs we can see, top MCQs, and we can practice that. Okay. Then next, sir, if a body corporate avails passenger transportation service for specific journey and does not take vehicle on rent, is it exempted or is it covered under contract carriage? So actually for a specific journey they are telling. Specific journey means it will come under contract carriage. If it is on a predetermined schedule on a predetermined route means it will be coming under contract carriage other than hire. But if it coming under specific voyage or specific journey means it will be contract carriage on hire and it will be taxable. It will be AC or non-AC, it will be taxable. Okay. Then kindly tell the name of this book. It's already there in the description. You please check, dear. It's there in the description of this video. Fine. So now we are moving on to place of supply. This is a very important chapter, as I told you in the beginning itself. So place of supply is divided into two. So total 4 sections we have for place of supply. That is section 10 and 11 in case of goods, 12 and 13 in case of services. What is the purpose of place of supply? Mainly to determine whether a transaction is intrastate supply or interstate supply or import or export. That depends upon the place of supply. So here place of supply, 4 sections. Section 10 deals with place of supply in case of goods, domestic transaction. 11 deals with place of supply in case of goods, international transaction. International transaction means import and export. Then place of supply in case of services. So 12 and 13 we have. 12 is applicable if both supplier and recipient are located in India. 13 is applicable if any one in India and the other outside India. Now, what if both supplier and recipient are located outside India? Whether place of supply is applicable, not applicable. Because just now we have seen when both supplier and recipient are located outside India, all the services are exempted. So if both supplier and recipient located in India, place of supply cannot be determined and it is exempted. Now we are looking into section 10. In case of section 10, section 10 is applicable when in case of goods, domestic transactions. So you try to remember this along with the clause. So 10(1)(a), when which situation will be applicable? 10(1)(a), supply involves movement of goods. 10(1)(b), bill to ship to transactions. 10(1)(c), supply does not involve movement of goods. 10(1)(d), assembly or installation at site. 10(1)(e), supply of goods on board during the journey of a conveyance. Okay, on board in a conveyance. So that is 10(1)(e). Total 5 situations we have. 10(1)(a), supply involves movement of goods. What will be taken as the place of supply? Ending point of the goods will be taken as the place of supply. If it is B2B transaction, there is an amendment here. B2B transaction, ending point will be taken as place of supply. B2C transaction, location of recipient in the records of supplier, otherwise location of supplier. So this is an amendment, please see this. Supply involves movement of goods. If it is B2B, we will take ending point. If it is B2C, then we will take location of recipient in the records of the supplier, otherwise we will be taking location of supplier. And 10(1)(b), bill to ship to transactions. Bill to ship to transactions, it is like on the instructions of my third person, the goods are delivered to the recipient. So you are the recipient, you place the order and you are asking me to deliver the goods to a third person. Now in that case, I will raise invoice to you. You are my billing address. The third person will be the shipping address. So in case of bill to ship to transaction, what will be the place of supply? It's not the ending point of the goods, but the billing address will be taken as the place of supply. And let it be B2B or B2C, answer is same. There is no change in that. Whereas 10(1)(c), supply does not involve movement of goods. Supply does not involve movement of goods. We need to take location of goods at the time of delivery. And suppose if it is B2B, suppose if it is B2C, same way, location of recipient in the records of supplier, otherwise it will be location of supplier, that will be taken. Example, so there is a person who owns a ship and that ship is located in the Mumbai port. Now this person who is located in Tamil Nadu is selling the ship by way of transfer of documents to the title. Say this, Mr. A is located in Tamil Nadu, whereas Mr. B is located in Kerala and Mr. A is registered person, whereas Mr. B is unregistered person, and there is a ship which is located in Maharashtra. Okay, now Mr. A transfers the document of title, transfer documents of ship to Mr. B, for which Mr. B pays the consideration, and where the ship is located? The ship is located in Maharashtra. Now in that case, whether it is 10(1)(a) or 10(1)(c), 10(1)(c), the place of supply will be determined under section 10(1)(c). Why? Supply does not involve movement of goods. Where the goods are located? The goods are located in that place only. So when supply does not involve movement of goods, what will be taken as the place of supply in this case? Section 10(1)(c). Before amendment, we used to take Maharashtra as the place of supply. Location of goods at the time of delivery. So location of goods is where? Maharashtra. But now the position has changed. As it is a B2C transaction, we need to take location of recipient in the records of the supplier. What is the location of recipient in the records of supplier? That is Kerala will be taken as the place of supply. Okay. Now, what if Mr. B is registered? Then what will happen? Still the same section, but it will become B to B. 10(1)(c), it will become B to B, and in case of B to B, location of goods at the time of delivery. What is the location of goods? That is Maharashtra will be taken. Now, what if Mr. B is unregistered and his details not available with Mr. A? So what if Mr. B is unregistered, B2C transaction, and his details are not available with Mr. A? Then section 10(1)(c). As per section 10(1)(c), it is B2C, location of recipient not available in the records of supplier. So location of supplier will be taken. What is the location of supplier? Tamil Nadu will be taken. So like this, the position will change. Previously, it was only one answer. What is that answer? So location of goods, that is Maharashtra. But now because of change in the provision, so they can change this way. Then next one, 10(1)(a). So 3 points we have seen. 10(1)(a), supply involves movement of goods. Ending point will be taken for B to B, and for B to C, location of recipient in the records of supplier, otherwise location of supplier. And 10(1)(b), remember B for bill to ship to transactions, billing address will be taken as the place of supply. 10(1)(c), supply does not involve movement of goods, so we need to take place of supply as the location of goods at the time of delivery in case of B to B. In case of B to C, location of recipient in the records of supplier, otherwise location of supplier. 10(1)(d), goods are assembled or installed at site. So in that case, we will take location where the goods are assembled or installed. And supply of goods on board in a conveyance, so starting point of the goods will be taken as place of supply. Then section 11, in case of import of goods, location of importer, not location where the goods are imported, but location of importer will be taken. In case of export of goods, location outside India will be taken as the place of supply. Now, in case of conflict between 10(1)(a) or B or C versus 10(1)(d) or E, which section will prevail? 10(1)(d) or E will only prevail. For example, you are asking me to install a machine in your branch in a different state. Now, I am taking the goods to the different state and I am doing the installation, and I raised invoice to you in this state. I am located in Tamil Nadu, you are also located in Tamil Nadu, you asked me to install it in Karnataka. Now in this case, I will take the goods to Karnataka, I will install it there and I will raise invoice to you. Logically, it's a bill to ship to transaction. Why bill to ship to transaction? You are my billing address, but I am delivering the goods in a different location. So it's a bill to ship to transaction. If you apply bill to ship to transaction, your billing address, so billing address will be taken as, your address will be taken as a place of supply, but actually 10(1)(b) should not be applied here. Why? This is a specific provision for installation or assembly at site. As it is installation or assembly at site, we need to take location where it is installed. Where is it installed? Karnataka it is installed. So Karnataka only will be taken as the place of supply. It's not an intrastate supply, it will become interstate supply. Remember, prefer specific provision over general provision. That's what I have given in the note. In case of conflict between 10(1)(a), B or C over 10(1)(d) or 10(1)(e), then 10(1)(d) or E shall prevail because specific provision prevails over general provisions. And then one more point you need to remember, if you are determining the place of supply under section 13. So place of supply under section 13, when we will determine services, when either supplier is in India or recipient in India and the other outside India, one in India and the other outside India, then in that case section 13 will come. Already we learned that wherever section 13 is applicable and if the place of supply is in India, it will be deemed interstate supply and it will be chargeable to IGST. Now we are moving on to section 12 and 13. So 10 and 11, this is what you need to remember. Then in case of 12 and 13, so easily try to remember this 12 and 13. First, general provisions. So situation wise you need to remember general provisions. So general provisions, when it is applicable in the absence of specific provisions, general provisions will be applicable. So nature of service, general provisions. So if it is section 12, B2B location of recipient, B2C location of recipient in the records of supplier, otherwise location of supplier. So that is the general provision. Whereas in case of 13, always it is location of recipient in the records of supplier because we don't have the category of B2B and B2C. So therefore it is location of recipient in the records of supplier. In the absence of that, location of supplier will be taken. So literally whatever is there as B2C here, that will be the provision in case of 13. So this is general provisions. So majority of the cases where there is no specific provisions, general provisions only will be applicable. Then second one is service in relation to immobile property, including accommodation services like renting or accommodation or construction service, architect services, real estate broker service. All these are service in relation to immobile property. In case of 12, check whether property is in India. Yes, then location of property is the place of supply. If property is outside India, what will be taken as place of supply? Location of recipient. Whereas in case of 13, always it is location of immobile property wherever the property is located. Then next, third, performance based service in relation to individuals. Examples of performance based service in relation to individuals is what? So for example, I am taking classes. This is an example of performance based service in relation to individual. Then personal grooming or training or performance evaluation or supply of food. So means recipient is individual. That is the meaning of performance based service in relation to individuals. If it is section 12, section 12 divided into 3. That is it related to food and beverages, outdoor catering, beauty treatment, etc. Then we need to take location where services are actually performed. Food and beauty related. In case of food and beauty related, performance location. Suppose if it is training and performance appraisal. In case of training and performance appraisal, we need to check whether it is B2B or B2C. If it is B2B, we need to take location of recipient. If it is B2C, location where services are actually performed. And in all other services, it will be general provisions. So 3 points you need to remember for performance based service in relation to individual. Related to food and beauty, it will be location where the service is performed. Relating to training and performance appraisal, B2B location of recipient, B2C location where services are actually performed. And all other services, it will be general provisions. Whereas section 13 you see. So physical presence of the recipient required, location where services are actually performed. Physical presence of the recipient not required, then we will be taking the general provisions. Then next one, performance based service in relation to goods. So for this, in case of section 12, we don't have any provision. So therefore the general provisions will be applicable. Whereas in case of section 13, divide it into 2. Physical presence of the goods required, physical presence of the goods not required. If physical presence of the goods required, location where it is actually performed, but we have 4 exceptions. In case of these 4 exceptions, it is not location where service are actually performed, but we will be going by the location of recipient. What are those 4 exceptions? If goods are temporarily imported for carrying out repairs or any other process, and it is exported after repairs or process without being put to use, then it is not location where service actually performed, but location of recipient will be taken as place of supply. Second exception, if we are doing some testing or process on the pharmaceutical products which are being imported, then also location of recipient will be taken. What is the difference between first exception and the second exception? In the first exception, after the process, the goods should have been exported without put to use. But in the second exception, that those goods, that medicines will get destroyed. The pharmaceutical medicines will get destroyed. So that will not be exported. Even then, location of recipient will be taken as place of supply. Then third exception, that is in case of repair, maintenance or overall in relation to aircraft or aircraft parts which are used for business purpose of the recipient. Then last point related to ships. In case of repairs, maintenance and overall in relation to ships or its parts which are used for the business purpose of the recipient. So these are the 4 exceptions. And in case of these 4 exceptions, we need to take location of recipient as place of supply. This is exception 2. So physical presence of the goods required, performance location will be taken. Whereas if physical presence of the goods are not required, what will be taken as a place of supply? Location of goods will be taken as place of supply. Then event related services. In case of event related, there are 2 things: admission to an event, organizing an event. So look into section 12. For admission to an event, location where the event is held. No more discussion there. Location where the event is held. But for organizing an event, we need to check B2B or B2C. B2B, location of recipient. B2C, location where the event is held. What if the event is held outside India? Then location of recipient will be taken as place of supply. But for section 13, we don't have any confusion like this. Let it be admission to an event or organizing an event. Always location where the event is held will be taken as place of supply. Then transportation of goods services. In case of transportation of goods services, there is an amendment now which says that in case of 12, it will be B2B, location of recipient, B2C, starting point of the goods. Previously, we had different provisions, India to outside India, ending point, otherwise starting point, like that. Now, no confusion. Always it will be transportation of goods, B2B, location of recipient, B2C, starting point of the goods. Whereas in case of section 13, previously we had specific provision, now they have omitted it, and therefore general provisions will be applicable. Then transportation of passengers. Transportation of passengers, so literally same for 12 and 13. So if you, literally same for 12 and 13, and moreover for 12 goods point and passenger point also same. You observe here, transportation of goods, transportation of passengers. B2B, location of recipient, B2B, location of recipient. B2C, starting point of goods, B2C, starting point of passenger. Okay, and here in case of 13, we don't have B2B, B2C classification, so always it will be starting point of the passenger. Now if you observe, where and all you can see B2B, B2C classification, just quickly go through that table. You can see B2B, B2C classification only in few places, correct? That too in 12. In 13, we don't have B2B, B2C classification. 12 and 13 only we get confused. That's why I'm telling you. So in case of 13, we don't have B2B, B2C. So therefore in 12 only we have B2B, B2C. That too where and all we have, just check. Training and performance appraisal, that is one place. Then organizing an event, that is another place. Then transportation of goods or passengers together. So you remember TOT, only in 3 places we will have B2B, B2C classification. What is a TOT? T for training and performance appraisal, O for organizing an event, T for transportation of goods or passengers. In that case only we have B2B, B2C, and B2B will be location of recipient, B2C will be respective provision. So what you need to do, you remember only B2C provision, because you know where and all B2B will come, and in that place location of recipient. So when you are remembering, don't remember B2B, B2C classification, you remember only B2C provision, and B2B will come in which place? Come on, respond. Only 3 places: training and performance appraisal, organizing an event, transportation of goods or passengers. B2B will be location of recipient. Okay, then so therefore what you need to remember, In case of training and performance appraisal, location where the services are actually performed. Organizing an event, location where the event is held. If the event is held outside India, location of recipient. Transportation of goods, starting point of goods. Transportation of passenger, starting point of passenger. Then next, services on board a conveyance. So in case of goods on board a conveyance, what we have taken? Starting point of goods. In case of service on boarding a conveyance, it is the starting point of the conveyance. Goods sold on board a conveyance, starting point of the goods. Services provided on board a conveyance, starting point of the service we don't know. So starting point of the conveyance, where the conveyance starts, that will be taken. Again, it is common between both goods and both 12 and 13. Starting point of the conveyance, starting point of the conveyance. Then in case of OIDR services, so in case of 12 it will be general provisions, we don't have any specific provision. In case of 13 it will be location of recipient. Then banking and other financial services. See, if you look into this, OIDR, banking and other financial service, intermediary services and hiring of a means of transport, in all these places, for 12 we don't have any specific provision, so general provisions is only applicable. Okay. So what are the cases where in 12 we don't have specific provisions? OIDR, banking, intermediary and hiring of means of transport. Okay. Only 13 we have. So in all these places 12 will be general provisions, and OIDR, what is the specific provision for 13? Location of recipient. Then banking and other financial services, what is the specific provision? If the service is provided to account holders, location of supplier. Otherwise it will be general provisions. That is very, very important. If the service is provided to account holders, then only it will be location of supplier, otherwise general provisions will be applicable. Whereas for intermediary services, always it is location of supplier. And next we have hiring of a means of transport. For hiring of a means of transport, divide it into two. Vessels or aircrafts, always general provisions. Any other vehicle up to 1 month will be location of supplier, and beyond 1 month will be general provisions. Okay. So here you need to know one point. 3 places location of supplier will be coming as the place of supply. What are the 3 places where location of supplier is place of supply? Remember RBI. Remember RBI. R, renting. Renting of what? Renting of what? Other than aircraft or vessel up to a period of 30 days. Okay. So here we will be taking what is the place of supply? Location of supplier. And then B. B for what? Banking and other financial service to account holders. I for what? Intermediary services. In these 3 places it will be location of supplier. I have given that below. You need to just write the short forms. So B to B, B to C. You remember it as TOT. Training and performance appraisal, organizing an event, transportation of goods or passengers. So in these 3 cases only B to B, B to C classification will come. Then location of supplier will be taken as place of supply in 3 cases. What is that? R, B, I. R for renting of other than aircraft or vessel up to a period of 30 days. B for banking services only to account holders. I for intermediary services. Then next, telecommunication service including broadband and DTH, and advertisement services to government. In these 2 places, for 13 we don't have any specific provision, it is general provision. For 12 only we have the specific provisions. Clear? So what are those 2? Telecommunication including broadband and DTH, advertisement service to government. In case of telecommunication services including broadband and DTH, so check section 12. If it is a fixed line, location where the equipment is installed. If it is mobile, check whether it is postpaid or prepaid. If it is postpaid, we will be taking billing address. If it is prepaid, so prepaid, is it online recharge? Yes. Then location of recipient in the records of supplier. Otherwise, it is location of the dealer. So where he is located. So in case of prepaid, dealer address. If it is online recharge, general provisions. Advertisement service to government. So each state where the advertisement is provided, that will be taken as the place of supply. Now you need to remember this like this only, and the short forms to some extent it will help you here. What is that? B to B, B to C classification only in 3 places. and location of supplier will be taken as place of supply in 3 places, that is banking, renting other than aircraft or vessel up to a period of 30 days, banking service to account holders, and intermediary service. Basically, what is an intermediary service? Intermediary services means there is a main activity and I am facilitating or arranging that main activity, then my service will be called as intermediary service, like commission agent or broker, etc. will be called as intermediary. Now, BPOs will not come under intermediaries because the moment it is outsourced, it's a continuing activity that will not come under intermediary. Intermediary is like one-time activity. I'm just connecting the seller and buyer. I'm just connecting the supplier and recipient. My job is done. So that is only called as intermediary services. That's what I have given below. You see, meaning of intermediary. An intermediary is someone who arranges or facilitates the transportation, the supply of goods or services or securities between 2 or more persons, wherein 2 of them transact in the supply of goods or services, the main supply, and the one in arranging or facilitating the said main supply. Therefore, outsourced activities do not fall under intermediary services. Okay. So this is about section 12 and section 13. Then there are few places between 12 and 13, there is no change in the provision. What are those? Search and tell me. In case of admission to an event, both cases it is same, location where the event is held, just check. And then in case of transportation of goods, not passengers, transportation of goods, transportation of passengers, it is starting point of the passenger, starting point of the passenger, correct? Of course, B2B, B2C difference is there, but the provision will be same. So admission to an event also, 12 or 13, the provision is same. What is that? Location where the event is held. Transportation of passengers also, it is starting point of the passenger, starting point of the passenger. Services on board a conveyance, there also we have starting point of the conveyance. Okay. Then we have IGST rules related to this place of supply. First, rule 3 we need to see. So we have these rules not tested in the old syllabus. So in old syllabus, not even one question they have asked on these rules. So I don't know whether it will be asked in future or not, but it's an untapped area. And if at all they want to make a question out of it, they can definitely make it. Is there in the syllabus. So first you need to know when which rule is applicable and what is this rules about. Basically these rules is about apportionment. Somewhere in intermediate overheads chapter you would have learned the apportionment on some basis, base of apportionment. Electricity means on the basis of mission hours or lighting, etc. you will apportion like that. Some basis of apportionment we have. Why it will happen like this? Wherein the contract price will be a single price and we will be providing the place of supply in more than one state. Now the contract price needs to be apportioned between the states. For that, what is the base of apportionment? First, rule 3. When rule 3 is applicable, advertisement service to government. So in case of advertisement service to government, can you please refer and tell me what is the provision? So each state where the advertisement is provided. Now advertisement service to government, there is a single contract and the total contract amount, how we need to apportion. So for that they have given different basis of apportionment. If the advertisement is on the train, you take the length of the track and divide it between the states. For example, there is a train which is starting in one state and going into another state through 2 other states. Now as this train is going through 3-4 states, now see the length of the track in each state and you take that as a base of apportionment between each state. Suppose if it is on the train tickets, you see how many stations are there in each state and you take that as a ratio for apportionment. Suppose if it is television channel, TV channel, you take the entire amount and you divide it between the channels based on viewership data. So you take number of viewers published by BRC of each channel in each state or union territory, and thereafter again you divide it between the states based on population census. So in case of TV channel, there are 2 ways of apportionment. Primary apportionment is between the channels based on viewership data. From where we will get the viewership data? BRC, Broadcast Audience Research Council. Last week of the last quarter, they would have published that data and you take that and you apportion it. Thereafter, if the channel is being telecasted in more than one state, then you divide it based on the population census. Then next, suppose if it is advertisement on internet, then the advertisement or internet deemed to be provided all over the country. So because advertisement, once it is in internet, so we cannot restrict it to any state. So deemed to be across the country, and based on the internet subscribers data, you need to apportion across the country in all states. Then next, if it is through SMS, so for SMS we need to take try telecom subscriber data. Again, last quarter, last week data should be taken for the purpose of apportionment. So 5 points you remember. In case of train, length of track. In case of train tickets, number of stations in each state. In case of TV, so based on channel viewership data and thereafter population data. And then we have internet across the country. And if it is SMS, so telecom subscriber data, so last quarter, last week, and thereafter population. Apart from this, any other mode of advertisement, it is the expenditure ratio. You just remember the ratio. In the question itself, all data will be given. You need to just remember the ratio and you apply that ratio and arrive at the answer. You will not find difficulty in doing it. But what you need to know is which case, which basis of apportionment will be taken is what you need to know. Apart from this, for any other case of advertisement service to government, it will be expenditure ratio. Then look into next one. That is in case of immovable property services. Any service in relation to immovable property, what will be taken as the place of supply? In case of 12 as well as 13, location of that immovable property, correct or not? What if the immovable property is in more than one state? That's where this rule 4 and rule 8 will be applicable. Rule 4 is in the context of section 12, rule 8 is in the context of section 13. 3 points only they have given. First, if it is accommodation services, you see number of nights stayed in each state as the base of apportionment. For example, a package tour. Under that package tour, 3 nights in Kerala, 2 nights in Tamil Nadu, 1 night in Andhra Pradesh. Then in that case, 3:2:1 ratio, you divide the total contract price. So that is a base of apportionment. So in case of accommodation, number of nights stayed in each state. Suppose if it is accommodation in a houseboat. So next, houseboat, what happens is that, so starting point one state, ending point another state, number of hours in each state should be taken as a base of apportionment. Apart from that, any other service in relation to immovable property, take the carpet area, floor area or carpet area and do the apportionment. For example, I got a maintenance contract in relation to 3 buildings belonging to one person. Now in this case, these 3 buildings are in 3 different states. Each building will have a square feet. So I will take the square feet ratio for the purpose of apportionment. So what are the 3 points? Number 1, accommodation services, number of nights stayed in each property. So each state, number of nights stayed in each state. Houseboat, number of hours in each state. Any other service in relation to immovable property, area of the immovable property in each state. Then rule 5 and 9 is applicable in the context of event services. In case of organizing an event, section 12, location of event will be taken as place of supply. Whereas section 13 also, location of event will be taken as place of supply. What if the event is in more than one state? Then this rule 5 and 9 will be applicable. What they are telling is one simple ratio, expenditure ratio. To conduct the event in different states, some expenditure will be incurred. Now, you take expenditure ratio. This is like a revenue recognition standard here. How we will recognize our revenue is based on our expenditure. Okay. So therefore, you take the revenue, recognize it based on your expenditure. See the expenditure of each state for the event and divide in that ratio. Then next, rule 6. Rule 6 is applicable in case of telecommunication services, that to fixed line services. In case of telecommunication fixed line, just check the provision. What will be taken as a place of supply? Location where the equipment is installed or the circuit is installed. What if I am providing a lease line service connecting multiple circuit points, so multiple states? Then in that case, what should be taken? Number of circuit points in each state should be taken as the base of apportionment. Next, rule 7 is applicable in case of performance based service in relation to individual and performance based service in relation to goods. But this is applicable in the context of section 13. Again, check the provision. In case of performance based service in relation to individual, what will be taken as a place of supply? Section 13. Section 13, performance based service in relation to individual. If physical presence of the individual required, location where service are actually performed, correct? Now, what if the service is performed in more than one state? Now, you say simple expenditure ratio. Now, I am providing services of fitness training to one actor and I am located outside India. the actor is located in India. Now I need to go to each and every shooting spot and need to provide the fitness services. Now in that case, I need to take my expenditure ratio and recognize my revenue. Simple. You understood? So that is with respect to performance based service in relation to individual. Again you check the provision. In case of performance based service in relation to goods, section 13, what will be taken as a place of supply? Location where service are actually performed. Correct. Now what if, that is in more than one state? Location where service actually performed is more than one state. Then if it is same goods, you divide it equally. Example, I got a AMC contract in relation to AMC to computers located in different states. Now I need to take equal ratio because it is all states computers only na. So I will divide equally between the states and I will recognize my contract revenue. Suppose if it is different goods, in Andhra Pradesh it is computers, in Tamil Nadu it is air conditioners, in Karnataka it will be some other goods. Now these are different goods, means different value will be there. So take the invoice value of these goods and you apportion your contract revenue. That is this. So therefore if it is supplies, services supplied on the same goods, equal ratio. If it is services supplied on different goods, invoice value ratio. Suppose if it is services supplied to individuals, then you will be taking GAAP ratio, that is expenditure ratio. So that is about this rules related information. Again I am repeating, we need to remember only the basis of apportionment, that will be sufficient. And then we have some circulars related to place of supply, and the first circular is related to what should be taken as the meaning of export of services. So it so happens that I enter into contract with a person located outside India to provide the services. So there is ABC Private Limited. Where is that ABC Private Limited located? In India. And X PLC is located in Germany. X PLC is located in Germany. Now ABC Private Limited entered into contract with X PLC to provide some services. Contract to provide services against a consideration of $5,000. Against a consideration of $5,000. But what happens here is that ABC Private Limited could not provide all the services to XPLC Germany. So therefore, what ABC Private Limited is doing, they approached Mr. Z, who is in Germany, to provide some services to XPLC. So there is another contract which is entered by ABC Private Limited in India, contract, okay, to receive services, contract to receive services against a consideration of $2,000, and ABC Private Limited is asking Z to provide the services to X PLC, and ABC Private Limited also provided some services to X PLC. Now X PLC is making the payment. What they are doing is that they are making a payment of $3,000 to ABC Private Limited, and they are paying an amount of $2,000 to Mr. Z. Why $2,000 to Mr. Z? ABC Private Limited is only asking XPLC to do that. So $2,000 anyhow they need to pay to Mr. Z. ABC Private Limited should pay $2,000 to Mr. Z. So ABC Private Limited is asking their recipient to pay $2,000 directly to Mr. Z and remit remaining $3,000 to them. Now the question is, what will be taken as the value of export of service? What will be taken as value of export of service? So the value of export of service will be $5,000 or $3,000. Logically speaking, they got only $3,000, but the contract is for $5,000. for which the circular says value of export of service will be $5,000, and then value of import of service. So as ABC Private Limited is receiving services from Mr. Z, there is value of import of service. That import of service is $2,000. On this $2,000, they need to pay IGST under RCM. So whenever there is import of service, GST is payable under RCM na. So you take export of service as $5,000, but there is an import of service to the extent of $2,000. On the $2,000, you pay GST under RCM. So that is this circular about. In case of export of services, exporter of services outsources a portion of service contract to another person located outside India. So ABC Private Limited outsources the contract to Mr. Z, who is located outside India. What would be the tax treatment of the said portion of contract in the hands of the exporter? There may be instances where full consideration is not received. $5,000 not received. Only $3,000 is received by the exporter in India, for which it is clarified that supplier of service located in India, that is ABC Private Limited, would be liable to pay IGST on reverse charge basis on the import of services on that portion of the service which has been provided by supplier located outside India to recipient in India. Who is supplier located outside India? Mr. Z. To ABC Private Limited, some services were provided na $2,000. On the $2,000, they need to pay GST under RCM. So that GST, whatever they have paid under RCM, they can take as ITC. And what will be taken as a value of export of service? Full value will be taken as a value of export of service. Then next one, in case of cargo handling services, basically cargo handling services means once the goods are imported, that imported goods will be kept in one place. So that is called as custodian's place. So this custodian will be responsible for the imported goods. So for which custodian will be collecting some custodian charges. So these charges are for cargo handling services. So here the confusion came as to whether it is renting of immobile property service or professional services, for which CBIC is giving a clarification. It's not renting of immobile property, because the basic objective here is not storage or warehousing. The objective here is handling the cargo. Therefore, it will come under general provisions, and location of recipient will be taken as the place of supply. So in case of cargo handling service, place of supply should be determined based on general provisions and not in terms of immobile property services. Then another case, we are importing a prototype. So that prototype is like a sample, and that sample is hardware, and the hardware will work on a software. Now we do the software testing. So to check whether this hardware functions in connection with the software or not, we are doing testing. Now whether it should be treated as performance based service in relation to goods, or it should be treated as software testing services. Because if it is performance based service in relation to goods, we have a specific provision. If it is software testing, general provision will be applicable. Even though a part is imported or a prototype is imported, the basic objective here is not doing anything on the prototype to do the testing on the software. So therefore it should be treated like software testing service only, and general provisions will be applied. So place of supply of software or designed by the supplier located in the taxable territory to service recipient located in non-taxable territory by using sample prototype hardware or test kits is a composite supply where testing is ancillary and general provisions will be applied. Then next, cutting and polishing of diamonds. So we are importing raw diamonds, and on that raw diamonds we are doing that some cutting and polishing work, and once the cutting and polishing is done, so thereafter these diamonds are being exported without put to use. Can we apply the exception number 1? Imported goods for carrying out repairs or process, and it is exported without being put to use. So can we get exception 1 where location of recipient is a place of supply? Yes. So that's what they are telling. In case of cutting and polishing activity on unpolished diamonds which are temporarily imported into India and not put to any use in India, the place of supply will be as per general provisions. Why it is as per general provisions? Because of exception 1. Exception 1. So goods imported into India for carrying out any repairs or process and exported without being put to use. Then there is one, like 2 circulars which they have added now. So this is an amendment. Place of supply for services with respect to advertising sector. Now listen, what happens is that usually we will be taking some hoardings on rental basis for the purpose of advertisement. Somewhere on the roadsides and all, if you see, big hoardings and all will be taken on rent for advertisement purpose. Whether it will be coming under renting of immovable property service or advertisement service. If it is advertisement service, we don't have any specific provision unless advertisement service to government. Advertisement service to government only we have specific provision, but normal advertisement service we don't have any specific provision, so general provision will come. Whereas if it is renting of immovable property, if you take hoarding as immovable property, then renting of hoarding will come under renting of immovable property, then we need to take service in relation to immovable property. So that's where the confusion came, and they are giving a clarification. If sale of space or sale of right to use the space on hoarding or structure of the vendor to client or advertising for display of the advertisement. So mainly the activity is sale of space for advertisement. Means already I have one hoarding. I am an advertising company. I have one hoarding. In that hoarding, plain sticker is there, white sticker, and in that I have mentioned contact so and so number. If you want to advertise here, like that I have put one number. Now you called me and I am giving you that space for advertisement. Now it will come under renting of immovable property. So therefore we will take location of immovable property as the place of supply. Of course the property is in India, location of immovable property. If the property is outside India, we will be taking location of recipient. Suppose it is like already I have that, and you don't want me to just give it on rent. You want me to do the designing activity on that. So you are telling me what is that you wanted me to advertise. I will take care of that and I will put it as an advertisement. Means you don't want it on a rental basis. It is like for 1 day or 2 days. You tell the information that I need to do the designing and I will put it there. Means here it is not merely sale of space for advertisement. Mainly I am providing you the advertisement services. Vendor providing advertisement services on the hoarding or structure owned or taken on rent by him. Then in that case, so general provisions, because primarily here it is what? Designing the advertisement. Designing the advertisements will come under advertisement services. Okay. So advertisement service we don't have any specific provision. So therefore general provisions will be applicable. Another circular you see. This is in case of co-working spaces. In co-working spaces what will happen? Lot of co-working spaces are there in cities. Workafella and Regus, like that lot of places are there. And in these co-working spaces I am taking a room on rental basis and I pay some 5,000 or 10,000 rupees. So main objective here is renting of immovable property. So it will be treated as service in relation to immovable property. Location of immovable property is place of supply. But if you expect any other service also from that, like they wanted you to provide the server space, they want to provide you internet or networking, etc., like security, firewall, internet, server access, etc., means the predominant objective there is not just renting of the place. So even other activities are also involved. Then in that case, you need to determine as per general provisions. See there, place of supply for renting of space for its own servers and other computing hardwares with basic infrastructure. Additional services are provided by the supplier. What are those additional services? Relating to hosting and IT infrastructure service like networking connectivity, backup facility, firewall services, or surveillance, monitoring the surveillance service. Then it is not just renting of immovable property. So therefore we need to apply general provisions and location of recipient. If B2B, B2C, location of recipient in the records of supplier, otherwise location of supplier. Whereas no additional service provided, just a place is given, you keep your computer and you do the working. So then in that case, it will be like renting of immovable property, location of immovable property will be taken as place of supply. So these are two latest circulars which they have added, and as it is amendment, definitely it is important that can be tested. Then next one, section 13 subsection 6 and 13 subsection 7, like that one provision is there, which is overriding the other provisions of section 13. What is that? 4 activities. Please concentrate. Service in relation to immovable property. All these are in the context of 13. All these are in the context of 13. So in case of service in relation to immovable property, what will be taken as a place of supply? Location of immovable property will be taken as place of supply. Performance based service in relation to goods, location where service are actually performed. Performance based service in relation to individual, location where service are actually performed. Organizing an event, location where the event is held. Correct. Now what if this is fully in India? Then place of supply India. What if it is fully outside India? Place of supply outside India. But the confusion comes when it is partly in India, partly outside India. Section 13 subsection 6 says, void a single contract if these 4 services, place of supply partly India, partly outside India, you deem it as entirely in India and tax it. Even that part which is provided outside India also, the place of supply deemed to be in India. Suppose if you make a separate contract when you make, accordingly you will take. Only when it is a single contract, the place of supply is deemed to be in India. Suppose if it is provided wholly in India, place of supply India. If it is provided wholly outside India, place of supply outside India. Provided partly in India, partly outside India, void a single contract, then the place of supply is deemed to be in India. Then next we have section 14. So section 10, place of supply, domestic transactions. Section goods, place of supply in case of goods, import and export is section 11. Place of supply in case of service where both supplier and recipient of service located in India, section 12. Place of supply in case of service when either supplier or recipient in India and the other outside India, section 13. Now one more section is there, 14 is there and 14A is there. So 14A is a newly added section. 14 and 14A. 14 is applicable in case of OIDR services. Now listen, OIDR services imported by NTOR, who will pay GST? Supplier outside India will pay GST, correct or not? But these suppliers outside India will be difficult to be identified by the Indian government, for which they are telling, if those suppliers outside India are connected through the intermediaries like hosting, so Play Store, App Store or any Windows marketplace, etc., then these intermediaries located outside India are primarily liable to pay GST. Example, there is a game developer. The game developer is located outside India. Play Store is also located outside India. Now you are NTOR, you are downloading the online game and you are playing that game. You spend some money. Now in that case, who is liable to pay GST? It's a OIDR service. Online gaming is OIDR service, na? It's a OIDR service. Liability to pay GST is on the supplier. Where is the supplier located? Outside India. So but that supplier and you are connected through Play Store. So they are asking Play Store to pay the GST. And why? Because it is easy to zero in the intermediaries, because we have few intermediaries only, lot of suppliers. So intermediary is having the liability here in case of import of OIDR services. So please concentrate. In case of import of OIDR services by non-taxable online recipient, where is the supplier located? Outside India. Where is the recipient located? India, and that is NTOR. And place of supply is what under section 13? For OIDR service, what is the place of supply? Location of recipient. What is the location of recipient? India. So it will become import of service? Yes. As the recipient is NTOR, it will be taxable under FCM. So who is liable to pay GST? Check here. Whether there involves an intermediary. No. There is no intermediary. Means directly you are downloading the game from the game developer, and like a APK file or EXE file you are downloading to your laptop or mobile and you are installing it and using it. Because in Android mobiles and all, lot of APK files we can download and install. Some websites and all banned, you cannot access it. So they will create apps. These apps also not available in the Play Store. So you can download the APK file and you can install it. You guys will not be knowing it. So lot of people will be knowing about it. You guys are like, you don't know anything other than studies. So therefore, you know, that APK file can be installed into the system. Okay. So therefore like that, from the game developer himself, you are downloading the game. Now in that case, there is no intermediary involved. So logically, who will pay GST? The original supplier only shall pay GST. Suppose if there involves an intermediary, but that intermediary is outside India or in India, that intermediary is in India, then again original supplier only shall pay GST. Got it? Suppose if the intermediary is outside India, yes, then check whether intermediary satisfies any one of the following conditions. Then intermediary will pay. If intermediary is not satisfying all these conditions, then original supplier will pay. So primary liability is on intermediary. Primary liability is on intermediary. So for that, where the intermediary should be? India or outside India? Outside India. And any one condition should be satisfied. What is that one condition? Invoice is raised by the intermediary. So in case of Play Store, App Store, they will only raise invoice. They will only raise invoice. And payment collected by intermediary. Even if they are not raising invoice, they will collect because in-app purchases. Suppose payment also they are not collecting, invoice also they are not raising, delivery is also not authorized by them, terms and conditions are also not fixed by them. Sir, when it will happen, sir? Netflix it will happen. I have seen this. Netflix app, when you download, if you want to activate by paying some money, you cannot do in-app purchases. You need to go to their website and create a username, password, and you need to make the payment in their website, and then you will get the access in the app. So in this case, payment is not collected by intermediary, invoice not collected, invoice not raised by intermediary, terms and conditions not fixed by intermediary, and delivery is not authorized by intermediary, correct or not? So now in this case, who will pay GST? The supplier. Original supplier only will pay GST. So if any one condition is satisfied, also intermediary will pay. So what are the conditions? Invoice raised by intermediary, or payment collected by intermediary, or delivery authorized by intermediary, or terms and conditions fixed by intermediary. Any one condition satisfied, intermediary shall pay. All the conditions not satisfied, so original supplier shall pay GST. Now wherever this intermediary or supplier is liable to pay GST, do they have a physical presence in India? If they have a physical presence in India, then they will register and pay GST. But the type of registration available to them is a simplified registration. What if they don't have physical presence in the taxable territory that is in India? Then do they have a representative in India? Yes, then that representative will apply for registration and pay GST. What if they neither have a physical presence nor they have a representative in India? Then they have two options. Either they can appoint a representative, that representative will register and pay GST, or they can continue outside India itself and still they can register and pay GST. It is not mandatory that they need to appoint a representative in India. But in case of e-commerce operator, you write there, however, in case of e-commerce operator, however, in case of ECO, if neither having physical presence, nor representative, neither having physical presence nor representative in India. However, in case of ECO, if neither having physical presence nor representative in India, they shall, not may, they shall appoint a representative. Appoint a representative. So for OIDR supplier or intermediary, not mandatory to appoint a representative. But in case of e-commerce operator, if they don't have a physical presence or not having a representative in India, they should appoint a representative in India. Then look into one more section, section 14A. In case of section 14A is applicable for online money gaming supplier. It's a very, very important because it's an amendment. Definitely this will be tested in exam. So online money gaming. Is online money gaming coming under OIDR services? No. Online money gaming will not come under OIDR services. In case of online money gaming, it is import of goods, but customs duty not applicable, IGST only applicable, already we discussed. Now listen carefully. There is an online money gaming supplier located outside India, and if it is imported by any person in India, not NTOR, imported by any person in India, the liability to pay GST is on the online money gaming supplier outside India. Is it clear or not? Sir, in case of import of online money gaming by any person in India, the liability to pay GST is on the supplier outside India. Don't check NTOR or other than NTOR. This NTOR other than NTOR is only for OIDR services, not for online money gaming. Then who will pay GST? The supplier outside India will pay GST. Do they have physical presence in India? Yes. Then they will register and pay. If they don't have physical presence and have a representative, that representative will register and pay. If they neither have a physical presence nor a representative, they shall appoint, not may. For OIDR, there is an option, but here they shall appoint a representative. That representative shall register and pay GST. Liability to pay GST is on supplier located outside India on import of online money gaming by any person in India. Such supplier have a physical presence in India? Yes, they will apply for simplified registration and pay. No, they have a representative in India. Such representative can apply for simplified registration. No, then they should appoint a representative. That representative should register and pay. It is not optional for them, they should appoint. Now, what if they are not paying GST? Their website, app, etc. will be blocked in India. If such supplier is not complying with the above information, above provisions, their information, website or app shall be liable to be blocked for access. Then we need to go to US, UK or Korea, etc. and we will be able to access that. Okay. So we can travel that. Without visa, passport, we can travel. You understood? So night times and a lot of people will be traveling to many places like this. Visa, passport not required. VPN only required. Okay. Then that is about place of supply. Okay, and in place of supply here I have completed this. So in the YouTube my team will be putting the timestamp. So you go to the timestamp for place of supply as many number of times as you can listen, you listen. Okay, because this is something, see, I did not see the book. I said it was in my fingertips. You know how I learnt? That many batches I took. Okay, so I learnt, and you will also will be learning. For that you need a practice. So if you listen to this for 3-4 times, it will get registered in your brain, and you happily do that, and any number of times you want to do, you do that. One day before the exam, don't forget to revise these 2 chapters, exemptions and place of supply. These are the 2 chapters definitely you need to revise and go. That is whatever I have discussed today so far. Exemptions and place of supply, mandatorily you need to study and go, because that's very important and we will forget it easily. That's why. Then value of supply we have completed, and input tax credit also completed. I think composition scheme also over, and we will take a break now and we will see this invoice debit notes and credit notes after break. Yes. Okay, we'll resume. So in this place of, there is one query, place of supply, we discussed about hiring of a means of transport. I just gave 30 days. Actually in law they use the word 1 month. They did not use the word 30 days. They use the word 1 month. So therefore 1 month, 30 days, both are same. So don't find any difference in that. Okay. So actually the word used in the law is 1 month. Okay. Then next we will see refunds under GST. So which is a very important chapter. So have a look into page 145. Page 145. So look into this chapter, refunds under GST. So refunds, basically there will be lot of questions on refunds that will be possible. These are all the various cases where a person will be able to get refund. So these are the various instances. So this is just the illustrative list. So first, refund of IGST paid on exports. So whenever we are making exports or zero rated supplies, we have two options: pay IGST and get refund of that IGST paid. So this is the first one, refund of IGST paid on exports. And then number two, refund of unutilized ITC, that is option 2. We can export or supply to SEZ without payment of GST and we can get the refund of unutilized ITC. Third, refund on account of deemed exports. There are certain transactions which are regarded as deemed exports and in that case we will be getting as refund. Then refund of balance in the electronic cash ledger. Whenever there is a balance, excess balance in the electronic cash ledger, after utilizing our liability, either we can carry forward it to the next month or we can get it as a refund, that is this. Then refund on account of issuance of refund voucher. So whenever we collect the advances, on the basis of advance we will give a receipt voucher. Whenever the supply is cancelled, so we will be giving a refund voucher, and based on refund voucher, whatever tax already paid on advance, we can get it as a refund, that is this. Then refund of tax on account of wrong classification, treating intrastate supply as interstate supply and vice versa. If we have paid any GST, so we can pay the correct tax and get the refund of wrong tax. Then refund on account of provisional assessment. So whenever a person is unable to determine GST payable or value, so then they can make an application to the officer for determining the tax, and first the officer will determine the tax on a provisional basis. Thereafter, upon final assessment, either the differential amount will be payable or if there is excess amount paid on provisional assessment, we will get it as a refund. So to claim that refund on account of finalization of provisional assessment, point 7 is applicable. Then point 8, refund on account of judgment or order. So we have paid some tax under protest and we made an appeal stating that we are not required to pay tax, and thereafter the court has ordered that we are not required to pay tax. So we will get a refund. That refund is known as refund on account of judgment or order. Then refund to UIN holder. UIN holder is that UN agencies, embassies or consulate. So they are basically called as UIN holder, unique identification number holder. Their outward supplies are exempted, but on their inward supplies, whatever GST they have paid, they can get it as a refund. To claim that refund, so that is option 9, refund to UN holder. Then refund of excess payment of tax. Refund of excess payment of tax is like, by mistake we have paid, instead of 1 lakh, 10 lakhs as tax, 9 lakhs paid in excess. So we can get it as a refund. Then last, refund to unregistered person, that is recipient, if the supplier has not issued a credit note. So what happens here is that supplier will be giving a credit note for the purpose of refunding the tax, but sometimes it so happens, so supplier is not refunding the full amount including the GST component. Example, you have booked a marriage hall and you paid 1 lakh plus GST 18%, 1,18,000 you paid as the booking advance. Now you cancel the booking. When you cancel the booking, actually they need to refund 1,18,000, but instead they have refunded only 1 lakh rupees to you. 18,000 rupees they have retained. When they have retained 18,000 rupees, actually they should not retain. They should have paid the government. So whether they paid it to the government or not paid it to the government, but you have borne the tax, so for which you can claim the refund as a recipient. So you can make an application for refund of that 18,000. So therefore, if the supplier has already given credit note, he would have refunded entire 1,18,000. That 18,000 if he has already paid also, his liability will be reduced. But this situation will arise when he has shifted the burden to you by way of collecting 18,000 from you, but he did not refund that 18,000. Now you can get that 18,000 as a refund. Whether your supplier has paid it to government or not paid it to government, you will get it as a refund. So government will recover that 18,000 from your supplier. So this is known as refund claimed by unregistered recipient if the supplier has not issued any credit note. So these are the various situations where a person will be getting refund. So total 11 situations are there. So in these 11 situations, there are certain things which are common and certain things we have separate provisions, so that we are seeing one by one. The first thing is refund in case of zero rated supplies. So what are considered as zero rated supplies? Export of goods or services, supply of goods or services to SEZ is known as zero rated supplies. In case of zero rated supplies, we have two options. What is option number one? Pay IGST and get refund of that IGST, and that IGST we can pay utilizing our ITC, and we will get the refund of gross IGST. Or option 2, so don't pay any IGST, export it under bond or LUT, or supply to SEZ under bond or LUT, don't pay any GST on outward supply, but on purchases, inputs, input services and capital goods, you will get refund only with respect to inputs and input services, but capital goods related credit you will not get it as a refund. Means a capital goods credit will be still in your credit ledger, that you can set off with your some other liability. Okay, so basically we are discussing the option 1 now. What is option number 1? So we export or supply to SEZ upon payment of IGST, and we will get the gross IGST as refund. Now you need to understand here few aspects. Whenever we are making zero rated supplies, we will get both the options, but in some scenarios we will get only one option, either option 1 or option 2. Sometimes we will not get the refund at all. Okay, so let's see this. What is it we are discussing? Zero rated supplies. What are considered as zero rated supplies? Zero rated supplies. What are considered as zero rated supplies? Export of goods or services, export of goods or services, and supply of goods or services to SEZ. So these two are called as zero rated supplies. In case of zero rated supplies, basically we have two options. So two options are available. Two options for claiming refund. Okay, what are those two options? Number 1, pay IGST on outward and get gross IGST as refund. This is one option. Whereas second option, so that is outward without payment of IGST under bond or LUT, and get refund of ITC with respect to what? Inputs and input services. Okay, so therefore these two options are available for the purpose of claiming the refund, but in some cases only one option is there. What is that? Say here, if you are exporting goods upon payment of customs duty, only option 1 is possible, option 2 is not possible. Is it clear? Export of goods upon payment of customs duty. Sir, whether exports are subject to customs duty? Yes, exports are subject to customs duty sometimes. There are some limited goods on export of which we need to pay customs duty. So export of goods upon payment of customs duty. Now in this case we will get only option 1. So option 2 we will not be getting. Option 2 is what? Refund of ITC we will not get. Then zero rated of exempted goods or services. In case of exempted goods or services are becoming zero rated, means what? Exempted goods or services are being exported or supplied to SEZ. In that case, there is no GST rate applicable to those goods and services. So option 1 not possible. What is option 1? Pay IGST and get refund of that IGST. On exempted goods and services, where from I can pay GST? So I cannot pay GST due to that reason. Zero rated of exempted goods or services means what? Export of exempted goods or services or supply of exempted goods or services to SEZ. Only option 2. What is only option 2 means? That is refund of ITC option. And there are some notified goods or services. Notified goods or services. In case of these notified goods or services like pan masala, tobacco products or some essential oils, etc. Okay, notified goods and services, that is pan masala, then tobacco products, etc. They have notified some goods. In case of these notified goods, neither option 1 nor option 2. Neither option 1 nor option 2 means literally we will not get any refund. So option 1 or option 2, both options we will not be getting. Then one more case we have, that is, sir, I am exporting the goods upon payment of customs duty. Option 1 not possible. But basically they are exempted goods under GST, but they are dutiable goods under customs. In that case also, neither option 1 nor option 2. You will not get both the refunds. So what is that? See this. Export of goods. Export of exempted goods under GST. Export of exempted goods under GST, but upon payment of customs duty. Then also neither option 1 nor option 2. Neither option 1 nor option 2. So both the options are not possible in that case. Example, rice. Rice is actually exempted. Rice sold in wholesale packages is exempted under GST. But on export of that rice, we need to pay customs duty. So in that case, as we pay customs duty on export, we will not get option 2. Why we will not get option 2? That's what we have seen here. We will not get option 2 when you are exporting goods upon payment of customs duty. So option 2 not possible. Okay. Option 1 also not possible. Why option 1 also not possible? Because they are exempted goods. As it is exempted goods under GST, there is no rate of GST. So option 1 also not possible, which means export of exempted goods under GST, but upon payment of customs duty, neither option 1 nor option 2. Same way, there are some notified goods or services like pan masala, tobacco products, essential oils, etc. There also we will get neither option 1 nor option 2. But in other cases, that is export of goods upon payment of customs duty only goods, then it will be only option 1. Zero rated supply of exempted goods or services, only option 2. These are some intricate points which you need to keep in mind as to when which option will be applicable. Then, so we are discussing first refund in case of zero rated supplies. First, exports. Exporter may supply goods or service or both subject to such conditions and safeguards on payment of IGST and claim refund of such tax paid. In that, suppose if it is goods exported, so we will be filing a shipping bill. That shipping bill itself will be taken as a refund application. There is no separate refund application in that case. Whereas in all other cases, we need to file a separate refund application, RFD1. RFD1 is the refund application. So remember, export of goods upon payment of IGST. What will be taken as the refund application? The shipping bill filed itself will be taken as the refund application. In all other cases means export of goods under bond or LUT or export of service on payment of GST or under bond or LUT. So it will be a refund application RFD1. Whereas this RFD1 when we are filing, refund processed by GST officer. Refund by GST officer. Whereas when we file the shipping bill, that refund is by customs officer. That refund is processed by customs officer. Then government notifies certain goods with respect to which refund cannot be claimed on export. What are those goods? That's what I said. Neither option 1 nor option 2. There are some notified goods. So what are those notified goods? Like pan masala, tobacco products, essential oils other than those of citrus fruit. These are some examples of notified goods right now. So this is an amendment. Please remember that in case of some notified goods or services, right now they have given only notified goods, but service also they can notify in future. Right now only notified goods are there. With respect to these goods, neither option 1 nor option 2. This amendment has been made in section 16 itself, Wide Finance Act 2021, but that was made applicable with effect from 2023. So therefore this can be tested. Then next, in case when we pay IGST on export of goods, who will process the refund application? Shipping bill is the refund application. So who will process the refund application? Customs officer. So customs officer will verify whether these goods are really exported based on the document filed by the person in charge. So person in charge of the conveyance will be filing export manifest in case of vessel and export report in case of vehicle and departure manifest in case of aircraft. In that they will mention what are the goods which are present in the vehicle or vessel or aircraft. Based on that, customs officer will come to know whether the goods are really exported, and based on our 3B, customs officer will come to know whether we have paid IGST. So then the customs officer will process the refund. So such application shall be deemed to have been filed only when the person in charge of the conveyance so duly files a export manifest in case of vessel, departure manifest in case of aircraft, export report in case of vehicle. Also, the applicant should have filed the return, because when he will pay tax, only in 3B he will pay tax. So he should have filed 3B and the IGST should have been paid in full. Then, in case of supplies to SEZ, who will process the refund application? GST officer only will process the refund application. But in that case, we need to get a certificate from the SEZ officer that these goods are supplied for the authorized operations of the SEZ. Then only we will be able to get the refund. So therefore, there is a special economic zone authorized officer or specified officer. This specified officer or authorized officer will endorse on the invoice that these goods or services are supplied for SEZ operations only. Therefore, based on that authorization or endorsement only, we will be able to claim the refund. That is this. Thus, proof of receipt as evidenced by the officer is a prerequisite for filing refund claim. Then in case of export of exempted goods or services, how many options we have? Both the options or only one option? Only one option. Which option? Option 2. What is it? Option 2, refund of ITC. That's the point I have given. So whenever you are making exempted goods, export of exempted goods or supply of exempted goods to SEZ, or export of exempted services or supply of exempted services to SEZ, you will have only one option. What is it? One option, refund of unutilized ITC. Refund of unutilized ITC. So whereas if the goods are taxable, if the services are taxable, you have both the options. And one more point you need to remember is that in case of export of exempted goods or supply of exempted goods to SEZ, generally option 2 is export or supply to SEZ without payment of IGST and get refund of unutilized ITC. But under bond or LUT we should have executed. But in case of exempted goods, bond or LUT not required. No bond or LUT. So there is a relaxation. So this can be tested in MCQ. In MCQ they will be giving state which of the following statements are correct in the context of refund. So they will be giving multiple statements in that they will be testing. So bond or LUT not required in case of export of exempted goods for claiming refund. We will think that this statement is wrong. No, this statement is correct. So refund, to claim the refund in case of export of exempted goods, not necessary that we need to execute a bond or LUT. Then, but in case of exempted services, whether we need to execute bond or LUT? Yes. Taxable, definitely we need to execute bond or LUT. Then look into the next one. So first situation means what? The first situation so is related to export or supply to SEZ on payment of IGST that we are getting as a refund. There, what are the nitty-gritties we have completed. Now we are moving on to the second case. What is the second case? Refund of unutilized ITC. When we will get this refund of unutilized ITC? in two cases we will get refund of unutilized ITC. Number one, zero rated supplies. Number two, inverted tax structure. What is inverted tax structure? The rate of GST on outward supplies is less than the rate of GST on inward supplies. Then also we will be getting the refund. How much is the refund in case of zero rated supplies? So case 1, maximum refund in case of export, okay, export or supply to SEZ, and case 2, maximum refund in case of inverted tax structure. So two cases we will get the refund of ITC. What are the two cases? Export including supply to SEZ, okay, including supply to SEZ, export as well as supply to SEZ. In both these cases we will get the refund of unutilized ITC, whereas the second one is refund on account of inverted tax structure. In case of zero rated, what is the refund formula? So in case of zero rated, the refund formula is net ITC into zero rated turnover divided by adjusted total turnover. So let's see this with the help of some numbers. So I have some inputs and I have some input services and even I have some capital goods. Using these inputs, input services and capital goods, I am making some finished goods, and in these finished goods, so few finished goods are exported and few finished goods are sold in India. Now what is the value of these inputs which is purchased? Say inputs is 1 lakh plus 12% GST, whereas input services is 50,000 plus 18% GST, whereas in case of capital goods it is 2 lakhs plus 12% GST. Now in this case, what is the total ITC that we have? The total ITC that we have, is 1 lakh into 12%, 12,000, plus 50,000 into 18%, 9,000, plus 2 lakhs into 12%, that is 24,000. So the total ITC, if you see 12 plus 9 plus 24,000, that is 45,000 is the total ITC. Whereas I am exporting the goods and the value of these exported goods is 20 lakhs and the value of this domestically sold goods is 10 lakhs. And on this 10 lakhs there will be definitely GST that is payable. On this 20 lakhs I have two options. So I am going for under bond or LUT. Under bond or LUT, whereas this will be excluding GST at 12%. Now in this case, what is the maximum refund that we will be getting? The maximum refund will be net ITC. What will be taken as net ITC? The refund formula is net ITC into zero rated divided by total turnover, adjusted total turnover. What is the net ITC? Net ITC is not 45,000. Net ITC should be only with respect to inputs and input services, that is 12,000 plus 9,000. 12,000 plus 9,000 will be taken as, so 21,000 into zero rated turnover. What is zero rated turnover? 20 lakhs divided by adjusted total turnover, that is 20 plus 10, 30 lakhs will be taken as adjusted total turnover. 21,000 into 20 by 30. So what is that? 21,000 into 20 by 30? 14,000 is the maximum refund, but we need to check the actual refund also. This is the last step which we usually miss in the exam. What is that last step? Check whether they have that much of balance in ITC to claim the refund. If you see 10 lakhs into 12%, what is 10 lakhs into 12%? 1,20,000. Okay, so even though they are eligible for a maximum refund of 14,000, but the actual refund will be zero. Why actual refund will be zero? Because they don't have balance in ITC. How they don't have balance in ITC? Simple. The total balance in ITC before claiming this refund was 45,000 and they have made some domestic sales. On domestic sales, the liability will be 10 lakhs into 12%, 1,20,000. For 1,20,000, this 45,000 would have been utilized. So it means they don't have any balance in ITC. So no balance in ITC. As there is no balance in ITC, refund will be zero. So but what we will do, we will write the answer as refund as 14,000 rupees and we end up losing entire marks. So the last step you need to do. What is that last step? Check whether they have sufficient balance in the ITC. If they don't have sufficient balance in the ITC, they will not be able to get any refund. Suppose if they don't have that much of liability, suppose if their liability is hardly some 12,000 rupees, then 45,000 minus 12,000, they have enough amount in the ITC. So definitely they will be getting this refund of 14,000 rupees. So always remember the refund formula is subject to the condition that there is sufficient balance in the ITC, otherwise we will not get the refund. So this is one point you need to keep in mind. Then another point, while taking the net ITC, we should not take the ITC on capital goods. We should take the ITC only on inputs and input services. So that is this formula, net ITC into zero rated turnover divided by adjusted total turnover. So net ITC means ITC availed, not total ITC, it is only eligible matched ITC. Which means in this net ITC, whether blocked ITC will come? No. Whether ITC for non-business purpose will come? No. Whether ITC for exempted supplies will come? No. So only net eligible matched ITC should be taken, that too on inputs and input services during the relevant period. So during the relevant period means whatever is the purchases made during the month or the period for which we are claiming the refund. So opening balance of ITC should not be taken. So in the question they will be giving some opening balance of ITC. Don't take that opening balance of ITC. So see what are all purchased, inputs and input services during the relevant period, that only should be taken. Minus ITC refund under rule 89 4A 4B. What is this ITC refund under 89 4A 4B? That is on account of deemed exports. So in case of deemed exports, like how in zero rated supplies we have two options, in case of deemed exports also we have two options. So first we will try to understand what are considered as deemed exports. So this discussion is related to zero rated supplies. Now we will see deemed exports. What are considered as deemed exports? There are three transactions which are considered as deemed exports. Supply of goods, only goods. Supply of services we don't have in deemed exports. Only supply of goods we have under deemed exports. So deemed exports, 3 points, that is number one, sale of goods to advance authorization holder. Who is an advance authorization holder? Advance authorization is a license which is given under foreign trade policy by Directorate General of Foreign Trade for the purpose of importing the goods without payment of customs duty or locally procuring the goods without payment of GST. In turn, that imported goods or locally procured goods should be used for exported goods. Mainly to encourage the exporters, they will be giving this license. Under that license, either they can import the goods without payment of customs duty or locally they can procure without payment of GST. So when you make sales to them, it will be called as deemed export for you. Okay, you are making sales to them. So for you it will be called as deemed export. Deemed export sale, for them deemed export purchase. Okay, next number two, sale of goods. Sale of goods to EPCG holder. Export promotion capital goods scheme, EPCG scheme holder. So again, like how advance authorization is for procurement of raw material without payment of customs duty or without payment of GST, same way for procurement of capital goods without payment of customs duty or without payment of GST, there is another license that will be given under foreign trade policy by DGFT, that is called as EPCG license. Ditto same, advance authorization is for raw material and EPCG is for capital goods. Either they can import without payment of duty or locally procure capital goods without payment of GST. So when you make sale of capital goods to them, for you it will be treated as deemed export sale and for them it is treated as deemed export purchase. And the third transaction will be sale of goods to EOU. Sale of goods to export oriented unit is called as again deemed exports. So EOU is export oriented unit, so which has the option of either importing goods without payment of customs duty or locally procuring the goods without payment of GST. So this EOU, export oriented units, if they want to locally procure and they purchase from you, for you it will be treated as deemed export sale, for them it will be treated as deemed export purchase. So these are the 3 deemed exports. In case of these deemed exports, what are the various options available? So for a person who is making deemed exports, 2 options available. 2 options available. So what is the first option? Under the first option, so supplier will not collect GST from the recipient, and supplier pays GST and they will be able to get the refund. Okay. So what happens here is that there is a supplier and the recipient is there. I am talking about option 1. In option 1, what happens? Supplier will make the deemed export to the recipient. Supplier will make deemed export to recipient, and the recipient will pay only the sale price. There won't be any GST. Only the sale price. Now to government, the supplier will pay the GST. How the GST will be paid? Either by utilizing his ITC as well as from the cash ledger. So pay GST. So this GST can be through electronic credit ledger and electronic cash ledger. So they will be making payment. Thereafter, so from government, they will be claiming the refund. Okay. Who will be claiming refund? Supplier will be claiming refund. But this refund will be given into their bank account. So what is the advantage of this option to them? So whatever ITC they have, using that ITC they can pay the liability and the entire amount will come into their bank account. So as a refund, so credit ledger balance will be converted into cash. That is the advantage. So in case of option 1, who is claiming refund? Supplier is claiming refund. Whereas option 2 is there. Option 2 is like there is a supplier who is making deemed export to the recipient, and in this case, so what happens? Supplier, when he makes deemed export to the recipient, the supplier recovers both sale price plus GST. Means from the supplier point of view, it will be like a normal sale. There won't be any difference. And the supplier will pay GST to government. And as supplier is paying the GST, definitely this GST can be paid through electronic credit ledger as well as electronic cash ledger. Now what happens is that the recipient will first avail ITC, and after availing ITC from the government, they will get the refund of ITC. Recipient will get refund of ITC into their bank account. Now what is the advantage of this to the recipient? Recipient will have ITC that will be converted into cash, means it is literally into their bank account. One more advantage is also there to the recipient. Even though it is blocked ITC, this is a CBIC circular, even though it is blocked ITC, they can avail ITC. That is the advantage to the recipient. And what is the difference between this refund of ITC versus refund of ITC that they have in case of zero rated supplies? Even in case of zero rated supplies, they will get the refund of ITC with respect to inputs and input services. What is the difference between this ITC refund versus this ITC refund? Because this is where generally we will be breaking our head and we will not understand. So please try to understand the differences here so that you will remember it forever. So in case of refund of ITC under zero rated supply, that refund is based on a formula. What is that formula? Net ITC into zero rated divided by adjusted total turnover. Even though those purchases are fully used in export also, you will get refund only as per formula. So I have made some purchases fully used in export. Full refund you will not be getting. You will get the refund as per formula into zero rated divided by adjusted total turnover only. Whereas if you want full refund, you made some raw material which is exclusively used in export. In that case, you should go for deemed export refund only. So therefore, here the advantage is no formula. How much ever you have made as purchase fully when you have exported, So therefore you will be getting full GST paid as ITC, and that ITC refund you will get. There won't be any formula. This is the first difference that you have. So in case of zero rated ITC refund, this refund is based on a formula. Here you will get entire amount of ITC as a refund. So there is no formula, etc. and all. Second difference, in case of zero rated, what happens is that if it is a blocked ITC or inward supply used for exempted supplies, etc. and all, you will not be able to get that as ITC. First of all, you cannot take the ITC. Mainly blocked ITC, you cannot take as ITC, where in the previous case, ITC on account of zero rated supplies. But in this case, even though it is a blocked ITC, you can take it as ITC and thereafter you can claim as a refund. So that is the advantage we have here. And then in the previous case, we will get ITC refund only with respect to inputs and input services. But in this case, we will get the ITC refund even with respect to capital goods, anything. But only condition is that all these things should be in turn used for the purpose of export. Okay. So here we will get the refund only with respect to inputs and capital goods, not input service. Because for deemed export, we don't have services. We have only goods. So means either inputs or capital goods. So in this case, it will be refund of ITC with respect to inputs and input services. Here we will get refund of ITC with respect to inputs and capital goods, because deemed export means only goods. So therefore, you need to decide either you need to go for this or that based on the comparison. Okay. So how to do that comparison? For that, I am just explaining you through an illustration. So what happens is that I have made some purchases. So there is a person ABC Private Limited. This ABC Private Limited is basically an exporter, and they are having even this AA, EPCG and all they have. Now they are making some procurement. That procurement is of raw material X. Using this raw material X, so this raw material X is fully used in FGX. Raw material X is fully used in FGX. And then they are making some procurement of raw material Y. And this raw material Y is used both in FG Y and FGZ. So in that, partly it is exported and partly it is sold in India. So then what they are doing is that using this raw material Y, they have got FG Y which is exported and FG Z which is sold in India, domestic sales. And FGX is fully exported. There is no change in that. Now, thereafter, they have got some raw material P, and using that raw material P, they made FGZ, and that FGZ is completely sold in domestic market. So, used for domestic sales, FGZ. Now, this is the story. Now, in this case, 1 lakh plus 12%, then 50,000 plus 18%, and 1,50,000 plus 12%. This is how they have. And if you see export value of this FGX is 5 lakhs, and export value of this FGY is 10 lakhs, and this FGZ domestic sales is 20 lakhs. So this is how they have got the data. Now here, suppose if I am not going for deemed export refund, so fully I am going for refund of ITC. So there are two alternatives for me. Deemed export also I can claim, or refund of ITC also I can claim. I want to go for refund of ITC option, fully refund of ITC. So I don't want to go for partly deemed export and partly refund of ITC. I want to go for fully refund of ITC on account of or with respect to zero rated supplies. Refund of ITC with respect to zero rated supplies. What is the formula for refund of ITC with respect to zero rated supplies? Net ITC into zero rated divided by adjusted total. Adjusted total. So net ITC, if you take ITC with respect to all three inputs. So the moment I will go for this refund of zero rate ITC on account of zero rated supplies, actually in a way I have an advantage. What is the advantage? You know, even though it is exclusively used for domestic, exclusively used for export, or commonly used for export and domestic, full ITC I will be getting as a refund in the formula. So therefore net ITC will be 1 lakh into 12%. How much 1 lakh into 12%? Net ITC 12,000 plus 50,000 into 18%. What is 50,000 into 18%? 9,000 plus, so 1 lakh 50 into 12%. 1 lakh 50 into 12% is 18,000. So 12,000 plus 9,000 plus 18,000, that is 39,000. Net ITC 39,000. And what will be the maximum refund that we will be getting? For that we need to get zero rated. How much will be taken as zero rated? Here the zero rated is 10 plus 5. So export is zero rated now, and we are not claiming any deemed export refund. So therefore 10 plus 5, that will be 15 lakhs will be taken as zero rated. And what will be taken as the adjusted total? The adjusted total will be equals to, so total, that is 5 plus 10 plus 20, that is 35 lakhs will be taken as adjusted total. And if you see the formula, maximum refund, how much is the maximum refund that you will be getting? Net ITC. Net ITC is 39,000 into zero rated 15 divided by adjusted total 35. 39,000 into 15 by 35. See that. 16,714 will be taken as the refund. So this is the maximum refund that you will be getting if you go for only refund of ITC with respect to zero rated supplies. Now suppose if I go for refund of ITC with respect to zero rated plus deemed export, if I go for both, then what will happen? Refund on account of deemed export. Refund on account of deemed export. What is the refund on account of deemed export? So in this question, on which case we will get the refund on account of deemed export? Supplier collected the GST from us. So option 2. So when deemed export we call as purchased goods fully used in export. Purchased goods fully used in export is called as deemed export. Purchased goods fully used in export means only raw material X in FGX. That is the only case we call it as deemed export purchases. Why? Because a purchased goods fully used for export, then only we will call it as deemed export procurement. So here raw material X is only deemed export procurement. So therefore how much is the refund that you will be getting? So with respect to raw material X, how much is that? So 12,000 we will get as a refund, correct? Plus in addition to that, we can also go for refund of ITC with respect to zero rated. We can also go for refund of ITC with respect to zero rated. We can do this also, zero rated supplies. And refund of ITC with respect to zero rated supplies, what is the formula? Come on. I am only speaking here. Net ITC into zero rated divided by total, adjusted total. And what is the net ITC as per the previous? As per the previous, how much is the net ITC? 39,000. But in this 39,000, already you claimed a refund of 12,000. So take out the 12,000. 39,000 minus 12,000. How much 39,000 minus 12,000? 27,000. And thereafter, zero rated. What is it zero rated? So how much is the total? Previously already we computed 15 lakhs. But in this 15 lakhs, already we have made a export on which we claimed a refund already. How much is the refund we claimed? And we claimed export refund. So 5 lakhs. So therefore it will be 10 lakhs. Again, adjusted total turnover. What was the previous adjusted total turnover? That is 35 lakhs. From the 35 lakhs, you take out 5 lakhs. Why you should take out 5 lakhs? Because this FGX related already we claimed as a refund. So 5 lakhs if you are excluding, so that will be coming to 30 lakhs. Then what will be the maximum refund? So the maximum refund will be equals to, so 27,000 into numerator 10, denominator 30, 27,000 into 10 by 30, that will be 9,000. So therefore, how much is the maximum refund you will be getting? So total refund, the total refund that you will get will be already 12,000 you got plus now 9,000, that will be 21,000. I jolly, we are getting more money. So 16,714 only you will get there, and here you are getting 21,000. So mainly to get more refund only they created a provision like this. You got it? So this net ITC, in 3 places we are reducing. So in 3 places we are reducing the effect. Minus 12,000. Why minus 12,000? Because already refund claimed. Why minus 5 lakhs? Already refund claim. Why minus 5 lakhs? Already refund claim. In 3 places we need to nullify the effect. Correct or not? Where and all we need to nullify the effect? One is net ITC. That's why you see there in net ITC minus ITC refund under 89-4A-4B. You got it? Again, numerator. Numerator is what? 0 rated. In 0 rated also we need to take out this effect. So 0 rated minus on which refund is already claimed under 89-4A-4B, supplies in respect of which refund is claimed under 4A-4B. Again in denominator also we should take out. What is the denominator? Adjusted total turnover. Here also minus supplies on which refund is claimed under 89-4A-4B. What is this supplies under 89-4A-4B? Deemed export only, on which already we have claimed ITC refund. So see there, what is refund under 89-4A-4B? When purchases of a registered person making 0 rated supplies. Who is the registered person making 0 rated supplies here? So this ABC Private Limited is making 0 rated supplies. Their purchases is deemed export. Correct or not? Their purchases, purchase of a registered person making 0 rated supplies are treated as deemed export. They can claim refund of GST paid, ITC availed. Whatever ITC availed fully they can get it as a refund on such inward supply called as deemed export refund. And such refund of ITC should be excluded while computing refund of unutilized ITC on account of 0 rated supply. That's why this 12,000, whatever we already got as a refund, that we excluded from this place, even its effect of turnover is also excluded. Okay? That is about this adjustment. Don't forget this here. I took lot of pain in explaining this. Then next. So 0 rated net ITC, understood the formula. What should be taken as net ITC? Inputs and input services minus ITC refund already claimed under 89-4A-4B. Then 0 rated turnover. What is 0 rated turnover? 0 rated supply of goods plus 0 rated supply of services. What will be taken as 0 rated supply of goods? So in the numerator, whether export of goods upon payment of IGST will come or without payment of IGST will come. Without payment of IGST, because on payment of IGST already we are claiming refund. So therefore without payment of IGST. Now sir, I have one doubt sir. In these 2 options, can I choose any option? Yes. With respect to each transaction, you can choose either option 1 or option 2. Not necessary that option 1 exercise in the beginning of the financial year will be applicable throughout the financial year. We don't have any such point in case of 0 rated as well as deemed export. We saw 2 options for 0 rated, 2 options for deemed export. With respect to each invoice, the supplier can choose any of the option that they can follow. Suppose if you are exporting on payment of IGST, that should not come in the numerator. So therefore you should take only value of 0 rated supplies made without payment of IGST minus supplies in respect of which refund is claimed under 89-4A-4B, or we need to compare with what? 1.5 times the value of such goods domestically supplied by same or similarly placed supplier, whichever is lower. So why they have created this comparison? Mainly because we are claiming some refund and we can inflate the export turnover mainly to get more refund. For example, refund of ITC on account of zero rated, So what is the formula? Net ITC into zero rated turnover divided by adjusted total turnover, correct? And in this, my original is say 25,000 into 10 divided by 30. 10 divided by 30. For example, I am telling you 25,000 into 10 by 30. How much I will get as refund? 25,000 into 10 by 30. 8,333 I will get as refund. Now what I am doing? I am inflating the export turnover. If zero rated inflated to so 25 lakhs, then what will happen? Refund equals to 25,000 into numerator is now 25. Accordingly, denominator also will increase. Numerator increase by 15 means denominator also will increase by 15. So 30 plus 15, 45. Sir, numerator denominator increased by same constant, sir. So therefore the result also will be same. No, that is stupid mathematics. So it is not multiplication, it is addition. So therefore 25,000 into 25 divided by 45. How much? 13,889. So generally government will loot us. But here we are looting the government by inflating this to 25 lakhs. So this is possible. That's why they are telling, darling, you can do this way. So you compare with 1.5 times the domestic value of these goods, whichever is lower only we will be giving you. So therefore this 10 lakhs is the original value of these goods, but this 10 lakhs is the export value. But what is its domestic sale value? This export goods, usually exports will be at a higher cost and the domestic value will be at a lower cost. What is its domestic value? Similar domestic value is 7 lakhs. Similar domestic value is 7 lakhs. Then in that case, what is it they are telling? So zero rated supply of goods. So zero rated equals to, so what is the value declared? 10 lakhs or 1.5 times similar value, whichever is lower. So what is the value declared here? The value declared here is 10 lakhs or 1.5 times similar value, 7 lakhs into 1.5. What is 7 lakhs into 1.5? 10.5 lakhs, whichever is lower. So that is 10 lakhs only should be taken as the value. What if its similar value is 6 lakhs? 6 lakhs into 1.5, 9 lakhs. So therefore 10 lakhs or 9 lakhs, whichever is lower, 9 lakhs only should be taken. That's why they have given. This is the meaning of zero rated goods. Now one more point also they are telling, that is either you take the value declared. What is the meaning of value declared? Again you take either FOB value or the transaction value, whichever is lower. So therefore the meaning of zero rated goods, so the meaning of zero rated goods will be three terms. Okay, value of zero rated goods equals to, so FOB value. Where is this FOB value available? In shipping bill. Where is this FOB value available? It is available in shipping bill. Or transaction value. Where is this transaction value available? Invoice, yeah, invoice. Transaction value in invoice. Sir, whatever is the transaction value in invoice itself is the FOB value, na sir. May or may not be. The transaction value can be X factory price, the price prevailing in your factory, or FOB price, price prevailing in your port, or CIF price, price prevailing in his port. So therefore anything can be transaction value. So the transaction value can be either X factory price, or it can be FOB price, or it can be CIF price. What is FOB price? The price prevailing at the exporter's port is known as FOB price. CIF price is the price prevailing at the importer's port. Means FOB price plus insurance plus freight will be taken as the CIF price. So anything can be taken as transaction value in the invoice. Domestic value, out of these three, whichever is lower will be taken. Lower of. So either you will take FOB value in the shipping bill or transaction value in the invoice, or 1.5 times the similar domestic value. Lower of these three will be taken as the zero rated goods. It's already there. Here you can see. So first you need to take value of zero rated supplies made without payment of IGST minus supply in respect of which refund is already claimed, or 1.5 times the value of such goods domestically supplied by same or similar supplier, whichever is lower. Again next line you see FOB value in the shipping bill or bill of export, or the invoice value, whichever is lower. So three terms, whichever is lower. Then in case of services, what will be taken as value of zero rated supply in case of services? I told you already, in case of services, only when you realize the foreign exchange proceeds, you will be able to claim the refund. So due to that reason, first we will take what are all the payments received during the period. During this period, what are all the payments received? But in this payments received, some payments may be pertaining to the supplies which will be made in future. So take out. Because you have not at all made supply, you may not make supply also, you may refund this advance also. That's why today it is doubtful. So minus advances for which the supplies are yet to be made in future. Add advances received in the past period for which supplies are made in the current period. At that time you reduce the advances, but you are making supplies now, so already payments are collected, you add that. So tell me what are the three things that we need to do for zero rated supply of services. First, payments received during the period minus advances during the period for which supplies are made in future. Add advances received in the past for which supplies are made in the current period. So once you make this adjustment, you will get zero rated supply of services. And thereafter, adjusted total turnover. What will be taken as the adjusted total turnover? So everything, non-zero rated, zero rated, everything will come. But why exempted supplies are excluded from the adjusted total turnover? Because this ITC will definitely not be pertaining to exempted turnover. When my outward supply is exempted, I cannot take ITC on inward supply. Due to that reason, this net ITC is not for exempted turnover. That's why in denominator, adjusted total turnover, we need to exclude exempted supplies minus supplies on which refund is claimed under 89.4A.4B. So all the adjustments we have seen. So this points and all are important for the purpose of solving the questions. Next, case 2. The another case where we will get the refund of unutilized ITC is on account of inverted tax structure. What will be taken as the refund in that case? They have given one formula, but you try to make it simple. So total 5 things you need to remember. So refund of ITC on account of inverted tax structure. What is inverted tax structure? The tax rate on outward supply is less than the tax rate on inward supply. Tax rate, not the tax payable, tax rate. So refund of ITC on account of inverted tax structure. Inverted tax structure. What we need to do? Total 5 things we need to get. First, we need to know net ITC. What is net ITC? In case of zero rated, we took net ITC as what? Inputs and input services. But here only inputs. Input services should not be taken. Only inputs. That should be taken in net ITC. And thereafter, number 2, inverted turnover. What is inverted turnover means? Inverted turnover means only that turnover where the rate of GST is less than the rate of GST on inward supplies. That is inverted turnover. Then third, you need to take adjusted total turnover. Adjusted total turnover. The meaning of adjusted total turnover is same. Already whatever we have seen in the above formula, net ITC into zero rated by adjusted total, the same meaning, no change in that. Then number 4, tax on inverted turnover. Tax on inverted turnover. And thereafter, so ITC with respect to inputs and input services. inputs and input services. These 5 numbers we need to get from the question. Net ITC, inverted turnover, adjusted total turnover, tax on inverted turnover, and ITC with respect to inputs and input services. These 5 numbers once we get from the question, so the refund is very simple. Refund equals to 1 into 2 by 3 minus 1 into 4 by 5. Logic and all go to hell. So don't remember now. Not possible also, don't break your head. So maybe if it is regular batch, I would have explained you the logic. So you remember this way, it is easy for you. 5 numbers you need to know. What are the 5 numbers? Net ITC. Number 2, inverted turnover. Number 3, adjusted total turnover. Number 4, ITC, that is tax on inverted turnover. Number 5, ITC on inputs and input services. Then 1 into 2 by 3 minus 1 into 4 by 5. If you are getting this, that will be the refund formula. Okay, that is what I have given. But net ITC is ITC availed only on inputs, but not on capital goods or input services, and meaning of adjusted total turnover is same as above. Then next, refund of ITC not available in the following cases. So what is the first case? You will know that export of goods upon payment of customs duty. That's what we have seen now. Option 2 is not applicable in some cases. What is the case where option 2 is not applicable? Option 2 not applicable, only option 1. Export of goods upon payment of customs duty. Export of goods upon payment of customs duty, only option 1. That's what I have given. Export of goods upon payment of customs duty, you will not get refund of ITC. Then second case, even in case of some notified services, so no refund of unutilized ITC. In case of supply of construction of complex or building or part thereof, and the amount charged from recipient includes value of land or undivided share of land. So in that case, entire consideration has been received before the issuance of completion certificate. This will be chargeable to GST. And what will be the rate of GST? Basically the rate of GST is 1.5% or 7.5%. And on inward supplies, the rate of GST is 18%, 28%, etc. and all. So they are telling, so you will treat it as export like inverted. You will treat it like inverted and you will claim any refund and all. No boss, you will not get refund. That's what they are trying to convey. Okay. And then if entire consideration has been received after issuance of completion certificate or first occupation, whichever is earlier, so then it will be coming under which category? So excluded from supply. Excluded from supply, but for the purpose of ITC, it will be treated as exempted. But when you are exporting it, means you are undertaking a project outside India, so then it may become zero rated and you may claim the refund of ITC in that case. So that's what they conveyed here. Then next, third refund is also there, merchant exports. Now another confusion here. Sir, what is deemed export? What is merchant export? Please try to understand, listen here. Sir, I am having advance authorization, sir. I am having EPCG license, sir. I am having EOU, sir. When you make sale to me, for you it is deemed export. Either you will claim refund or I will claim refund. Correct or not? Deemed export refund. Again I am repeating. I am having AA, I am having EPCG, I am having EOU. When you sell to me, for you it is deemed export. Either as a supplier you will claim refund or as a recipient I will claim refund. What if I don't have AA? What if I don't have EPCG or I am not a EOU, but I am an exporter? I procure the goods from you. Now in this case I am called as a merchant exporter. I am procuring goods from you and I am exporting it, but I will not get the deemed export refund. So then is there any alternative available for me? Yes, they created an alternative for me. What is that? I will procure from you at 0.1% GST rate. Means you will sell to me at what rate? 0.1%. Means for you it will be inverted, correct or not? Your purchases will definitely be more than 0.1% only. So when your sales to me is at 0.1%, this transaction will be like an inverted tax structure for you. So you will claim the refund of ITC. Now how much I paid on purchases? 0.1%. This 0.1% I will take as ITC, and I will export the goods without payment of GST under bond or LUT, and this 0.1% I will get as a refund. You understood? What is the time limit within which I need to export it? I need to export it within 90 days from the date of purchase. See this? Merchant export means export through third parties. Sale of goods to such third party by a supplier. So you are supplying it to me, so it will be taxable at 0.1%. CGST 0.05, SGST 0.05, IGST 0.1%. Such supplier making supply to such third party can claim refund of unutilized ITC under inverted tax structure. So you can claim refund under inverted tax structure. Such third party can avail ITC. I am the third party. I can avail ITC at the rate of 0.1%. GST paid on invert supply, and I should export the goods. What is the time limit within which I should export the goods? Within 90 days from the date of purchase invoice. Under which option I need to export the goods? Under bond or LUT without payment of IGST. Then deemed exports discussion, already we have seen what are the options available, etc. Then fourth one, refund on account of wrong classification. What is this? Treating intrastate supply as interstate supply, I have paid some GST, wrong GST. Now I need to pay the correct GST, and thereafter I will get the refund of wrong GST whatever I have paid. For example, I should pay CGST, SGST, but I paid IGST. Now I have to pay CGST, SGST and get refund of that IGST. And in this case, whether I have to pay any interest or penalty, etc., no, because there is revenue neutral. There is no loss to the government, nah. So it's a revenue neutral exercise. Wrong classification, intrastate supply subsequently held to be interstate supply and vice versa. Sir, subsequently held means how it will be known? Either you may identify that or department may identify. Meaning of subsequently held means either identified by the taxpayer or by the tax officer. Then refund of wrong tax upon payment of correct tax. So first you pay the IGST and then you will get the refund of CGST, SGST, or you pay CGST, SGST and get refund of IGST. And refund application, same RFD 1, within 2 years from the date of payment of wrong tax or correct tax. First you pay the correct tax, then only you will get refund. So within 2 years from the date of payment of correct tax. Then suppose if the supplier has rectified this mistake by giving a credit note. First I treated it as interstate supply. I gave a credit note cancelling this. Again I gave an invoice for intrastate supply. Now in this case, whether refund will be applicable? No, because I have rectified already. So refund of wrong tax paid not available if the taxpayer has made tax adjustments through issuance of credit note under section 34. Then next one, refund to UIN holder. Who is a UIN holder? Specified agencies of UN like UNESCO, UNICEF, etc. and embassy or consulate located in India. So basically these people are called as UIN holder, and their outward supplies will be exempted. So they are not required to pay any GST on their outward supplies, but they are making some procurement, imports. They are making some import of goods. So because these people will be liking to drink quarter only, water they will not drink because they are foreigners. So when they are foreigners, definitely they will not like Indian brands and all. So foreign brands only they will be preferring. So therefore goods are being imported, and not only liquor but also many goods, many things like bread, cheese, whatever, whatnot. They will not buy anything Indian. They will buy everything foreign only because these people are foreigners. Foreigners only coming and working in embassies, consulates and all, because our people will be located in their embassy, their country. So whereas they will be here in our embassies or consulates. So therefore import of goods will be done. On import of goods, there will be sometimes customs duty along with IGST. That IGST, they can get it as a refund. Then second, local procurement sometimes they will be making. So these local procurements, whatever GST they paid, both goods and services, whatever GST they pay to the supplier will pay GST to government. From government, they will get the refund. But why import of service is not there? Import of goods is there. Local procurement of goods and service is there. But why not import of service? Because import of service chargeable to GST under RCM, they need to compulsorily register. But their outward supply is fully exempted, so they are exempted from registration. Section 23 overrides Section 24. Consequently, they will not pay GST on import of services. IGST not payable on import of services as section 23 overrides section 24. Now these UIN holders is getting refund now. So that refund, what is the refund application? The regular refund application is RFD1. But in case of export of goods upon payment of customs duty, refund application is shipping bill. And in case of refund of UIN holder, the refund application is RFD10. Along with a statement of inward supplies in GSTR 11. And UIN of the recipient should be mentioned in the tax invoice, because in GSTR 1 when we create the invoice, so we have to put it under B2B, not B2C. So even though UIN holders are not registered persons, but whenever we are making sale to UIN holders in GSTR 1, it should be classified under B2B supplies, means UIN should be mentioned in the invoice, then only they will be able to get the refund. Suppose if UIN is not mentioned in the invoice, then the refund will be available if the copy of invoice is attested by the authorized representative of the applicant. And once they make refund application in RFD10, an acknowledgement will be given in RFD2. An inward supply should have been received against a valid tax invoice, and the refund application shall be filed within 2 years from the last date of the quarter in which supply was received, which means they will go for refund not on a monthly basis but on a quarterly basis from the quarter end within 2 years. Refund not allowed with respect to single tax invoice where the value is less than 5,000. Suppose if they make a purchases which is of less than 5,000, like 4,999 like that, then in that case whatever GST paid they cannot take no refund. So instead what they should do, they should ask the supplier to accumulate and get an invoice more than 5,000, then only they will be getting refund. And the refund order will be passed in RFD6 within 60 days from the date of application of refund. Now we have some procedural aspects. In these procedural aspects, first you need to remember few forms. RFD1. What is the purpose of this RFD1? Refund application. RFD2 is known as acknowledgement. RFD3 is known as deficiency memo. RFD1 application, RFD2 acknowledgement, RFD3 deficiency memo. RFD4 will be provisional refund, in which case whenever we are making zero rated supplies, so within 7 days 90% of our refund claim we will get it as a refund on provisional basis prima facie without processing the refund application. So because of encouraging the exporters, they are giving this provisional refund. How much will be the provisional refund? 90% of the refund claim. What is the time limit within which it will be given? Within 7 days it will be given. So that is known as provisional refund, which is in RFD4. RFD5 is known as payment order. Once the refund is sanctioned, then to your bank account they need to release. That is called as payment order RFD5. Then RFD6 is final refund order. So for payment of the difference 10% or for sanctioning the refund, so they will be using RFD6, that is final refund order. Then one more form you need to remember, RFD10. RFD10 is application for refund by UIN holder. Now look into the procedural aspects. First point, in these procedural aspects everything is important for MCQ purpose. So all these procedural aspects will be tested for MCQ purpose only. Okay, see the first one, application for refund. What is the refund application? RFD1. But in case of refund to UIN holder, it is RFD10. And in case of refund of IGST paid on export of goods, it will be shipping bill. And whenever you are making application for refund, that application for refund, Aadhaar authentication is mandatory. Then once you make application, you will get an acknowledgement. What is the time limit within which you will get acknowledgement? Within 15 days. In that acknowledgement, you will have the date on which you made the application, and acknowledgement or deficiency memo you should get within 15 days. If the application is proper, you will get acknowledgement. If there are some deficiencies in the application, you will get a deficiency memo. So either within 15 days RFD2 or RFD3. Then time limit for filing refund claim. What is the time limit within which you need to make refund claim? 2 years from the relevant date. But see there, while computing the 2 years, the time period from the date of deficiency memo till the time you make a revised application, so that time limit will be excluded, so that your overall time limit of 2 years will be intact. Sir, what does it mean? It means that the relevant date the relevant date for refund application is, say 10/8/2023 is the relevant date. What is the time limit within which we need to make refund application? 2 years. So RFD1 filed on say 5/8/2025. Is it within 2 years? Yes. Within 2 years we file RFD1. Thereafter so you got a deficiency memo, RFD 3. Okay, RFD 3 is the deficiency memo on RFD 3 you got on 25/8/2025. Okay, sorry, 15 days, exactly 15 days, 28/2025 you got the deficiency memo. When you got the deficiency memo, again you have rectified the refund application and you need to file the new refund application, RFD1. So, but this is revised RFD1, file immediately the next day, say 22/8/2025 you filed. But if you see from 10/8/2023 to 22/8/2025, it is beyond 2 years. It is beyond 2 years. So whether this refund application is valid or invalid. Now we need to take the total time period. What is the total time period? 10/8/2023 to 28/8/2025. 2 years plus how many days extra? 12 days, correct? 2 years, 12 days, minus what is the period from original refund application to deficiency memo? What is the period? 15 days. You exclude this 15 days, minus 15 days. Now, what is the period here? 1 year, 11 months and 27 days, which is less than 2 years. Therefore, revised RFD1 is valid. So this is how you need to check. So first you need to take the overall time limit from the relevant date till the time you file the revised refund application and see the total time, minus you exclude the period from the date on which you filed the refund application, original refund application, till the date you got the deficiency memo. You take out that period. Once you take out that period, you will get the effective period. Is that effective period within 2 years or not? You check. If it is within 2 years, then the revised refund application you have filed will be valid. That is the meaning of that. So while computing 2-year period from the date of filing refund claim till the date of communication of deficiency shall be excluded. Then time limit of 2 years is not applicable. Only in one case this time limit is not applicable. Refund of balance in the cash ledger, because that is your money to give refund to you. Why the time limit will be applicable? So in case of refund of balance in cash ledger, this 2 years time limit not applicable. Then provisional refund is possible. To what extent provisional refund is possible? 90% of the refund claim. In which case? Only in case of zero rated supply. Highlight that. Provisional refund is only in case of zero rated supplies. And the provisional refund order will be passed in RFD 4 within 7 days from the date of acknowledgement, and payment order shall be issued in RFD 5. Okay. So what is the time limit within which we will be getting refund here? Within 7 days from the date of acknowledgement, and one payment order will be passed. What is that payment order? In RFD 5. And final refund order is passed in RFD 6, and the payment order shall be issued in RFD 5. So therefore 3 forms: RFD 4 provisional refund order, RFD 5 payment order, RFD 6 final refund order. What is the time limit within which RFD 6 will be passed? Within 60 days. Okay. this RFD 6 will be passed within 60 days from application. Within 60 days from application. But provisional refund order is within 7 days from the date of acknowledgement. Then payment order issued in RFD 5 needs to be revalidated if refund not disbursed in the same financial year. So they need to revalidate that payment order. In case of unregistered person, date of issuance of letter of cancellation, so is the date of receipt of services by the applicant. So from that date 2 years will be counted. Then withholding of refund. What is this withholding of refund? Sometimes by mistake, not by mistake, sometimes there is an order which is pending against a person and the person has to pay some amount, and the same way some refund is also due to him. Now whenever the recovery starts, whatever is the pending amount that he need to pay to the government, that will be adjusted from the refund that is to be paid to that person. So that's why whenever there is an outstanding demand order, the refund will not be released, it will be withheld. So if there is any outstanding demand against a person to whom refund is payable, then such proper officer can pass an order for withholding the refund. Where proper officer or commissioner is satisfied that refund is no longer liable to be withheld, he may pass an order for release of withheld refund in prescribed form. First proper officer should release the withheld refund and then only pass the refund sanction order. And next one, this is a very important area, refund subject to unjust enrichment. Many times they have given short note questions on this. What is the meaning of refund subject to unjust enrichment? I need to prove that I have not transferred the burden of tax to the next person. So refund subject to unjust enrichment means one person should not be enriched at the cost of others. Means I will recover the GST also from the next person and I will claim the refund also. That's a double benefit. I should not enjoy this double benefit. Refund is subject to the condition that there is no unjust enrichment, which means refund shall not be granted if the registered person failed to prove that burden is not transferred to the recipient. How to prove that? So either if the refund amount does not exceed 2 lakhs, self-declaration. If the refund amount exceeds 2 lakhs, certificate from a CSMA. Already in ITC also we have come across this. ITC does not exceed 2 lakhs, self-declaration. ITC exceeds 2 lakhs, certificate from CSMA. Just like that. Suppose if declaration is not submitted or certificate is not submitted, then the refund amount will be transferred to consumer welfare fund. If declaration or certificate not submitted, refund application cannot be filed and such amount shall be credited to consumer welfare fund. But there are 6 cases where we don't have to file declaration or certificate, but we will get the refund. So what are those cases? Means these cases are exception to the doctrine of unjust enrichment. So what are the exceptions? Number 1, refund of IGST paid on export of goods or services. And number 2, refund of unutilized ITC on account of zero rated and inverted tax structure. So refund of ITC. First one is export of goods on payment of IGST. Number 2 is refund of unutilized ITC. Number 3, refund arising on account of refund voucher. Refund on account of wrong classification, intrastate as interstate, and refund of excess balance in the cash ledger. And finally refund claimed by the unregistered recipient, because he is the recipient, so you don't have to prove unjust enrichment. These are the 6 cases, no need to prove unjust enrichment, we will get the refund. Then consumer welfare fund, already we have seen, if neither declaration nor certificate is given to prove unjust enrichment, the money will be transferred to consumer welfare fund. Also any income from that fund, that is out of investment of that money, if you generate any income, that will also be credited to that fund, and a committee will be appointed for utilization of that fund, and the committee should not spend more than 50% of the amount credited for publicity or consumer awareness on GST, and also ensure that minimum 25 crores is available for the purpose of consumer welfare activities. So this is one provision. So maybe somewhere in MCQ they will be testing how much maximum can be spent for publicity and consumer awareness of GST. 50% of amount credited. What should be the minimum amount that should be maintained in the fund? 25 crores. So this is about refund under GST. Okay, we'll start. as we completed refunds, please look into the next segment, that is segment 13, payment process. So in this payment process, we have two sections, four sections mainly, in that the two sections are 49 and 50. 49 talks about what are the various ledgers which are maintained by GST network on behalf of every registered person. Section 50 talks about interest computation. Then two more sections which previously was there in levy that has been brought here, payment process, that is TDS and TCS. These are the four sections, section 51 and 52. So 49, 50, 51, 52. 49 talks about various electronic credit ledgers. At the end of this book, I have given this section index. So please make use of the section index. What section, what is that talking about, and what is the page number of that particular section, where and all it is there. At the end of the book you can find. So that will be definitely be helpful for you, so that in case any section number you are not able to recollect, you refresh that. So reason being, in exams sometimes the provisions are directly asked on section, so they will not tell what it is, so they will tell. So what are the conditions or what are the situations leading to consequences under section 29, like that they will give. What is the 29? Cancellation of registration. So sometimes we don't know what is that section, so that's why it is better to make note of what are all the sections that already I have done at the end of the book. You please make use of it. Okay, then see this section 49 which talks about various electronic credit ledgers, 50 interest, 51 TDS and 52 TCS. First 49, subsection 5 already we have seen in input tax credit, manner of utilization of credit, that four principles we have seen, IGST credit, no restriction, etc. So now the remaining provisions of 49 is discussed here. There are three ledgers which will be maintained by GST network on behalf of every registered person. Those three ledgers are electronic liability ledger, electronic credit ledger and electronic cash ledger. Electronic liability ledger contains the details of liability, from where information will go into electronic credit ledger whenever we file our returns. GSTR1 and GSTR3B, electronic liability ledger will have the information about liability. Electronic credit ledger, how there will be inflow into electronic credit ledger the moment we take the ITC. How we will take ITC? Either through GSTR3B or ITC1 or ITC2 or ITC2A. ITC1 is availment of ITC on closing stock. ITC2 is transfer of ITC on account of transfer of business. ITC2A, transfer of ITC on account of single registration is getting split into multiple registrations, or refunds. So sometimes we will pay excess tax, so that excess tax will come as refund into the respective ledger. So suppose in a particular month we have paid tax in excess 1 lakh. For that month 60% we paid through electronic credit ledger and 40% we paid through electronic cash ledger, that month liability. Now 1 lakh we paid in excess now in that month. In that month lot of liability is there, but excess paid is 1 lakh. And we need to see the ratio in which the liability is discharged in that month. 60% using credit ledger, 40% using cash ledger. So in the same ratio, that 1 lakh will be given back to us into our respective ledger. So that money also will come into the electronic credit ledger, which can be used only for payment of tax dues. The liability of a registered person is divided into 5. T, I, P, F, O. T for tax dues, I for interest, P for penalty, F for fees and O for others. These are the 5 dues of a registered person. Now in this, the electronic credit ledger balance can be used only for payment of tax dues. It cannot be used for payment of other dues. Then the balance in electronic cash ledger. How money will come into cash ledger? Whenever we make a deposit through payment challan, PMT6 challan, any TDS or TCS deducted or any refunds, it will come into cash ledger. But the balance in cash ledger can be used for payment of tax dues as well as other dues. But the balance in credit ledger can be used only for payment of tax dues. So whatever is the outflow from the credit ledger, that will be inflow into the liability ledger. Whatever is the outflow from cash ledger, that will be inflow into liability ledger. And this liability ledger will be having a prescribed form, that is PMT1 is the format of liability ledger, PMT2 credit ledger, and PMT5 is the cash ledger. And the balance in electronic credit ledger or electronic cash ledger, after payment of interest, penalty or fee or any other amount, we can claim as a refund. Now, special points with respect to cash ledger. So first is that what are the various modes of deposit. So far we have seen, so 4 forms: PMT1 liability ledger, PMT2 credit ledger, PMT5 cash ledger, PMT6 deposit challan. Okay, now we need to make a deposit. What are the various modes of deposit? Total 6 modes of deposit we have. Number 1, so debit card, credit card, internet banking, NEFT, RTGS, cash deposit over the counter. But over the counter cash deposit up to how much is allowed? Up to 10,000 rupees in a tax period. Tax period here is monthly. And in case of composition scheme, the tax period will be quarterly. And even 2 more modes is also there, UPI and IMPS. Then when the payment is debited in the bank account but not credited in the electronic cash ledger, we need to raise a complaint to the payment gateway through the portal, and the form for that is PMT7. Then for transfer of balances between major heads and minor heads, sometimes it so happens that between major heads and minor heads there will be some shifting of balance that is required. For example, what are the major heads and minor heads? We have 4 major heads: CGST, SGST or UTGST, depends, either one will be there, SGST or UTGST, IGST and cess. These are the 4 major heads, and for every major head we will have 5 minor heads, T, I, P, F, O. So there will be a 20 cell matrix. Now by mistake we deposited in CGST, SGST, and we know that we have to pay IGST. We can shift the balances from CGST, SGST tax to IGST tax. Suppose if we have made the payment, thereafter we should go only for refund. Before filing 3B itself, you know that intra is treated as inter, inter is treated as intra. We can rectify in this place itself by shifting the balances. For that we need to file one form, that is PMT9. Suppose after making the payment of tax, means after filing 3B, if we come to know intra is inter or inter is intra, we should go only for refund. So that is the advantage of PMT9. Not only between taxes, from any cell to any cell we can shift the balance. From CGST penalty to IGST interest also we can shift. There is no restriction. Not from tax to tax only. Penalty head to interest or penalty head to late fee. Tax to late fee. Any cell to any cell we can shift the balances. For transfer of balances between major heads and minor heads in electronic cash ledger, form GST PMT9 is notified. PMT9 has got one more purpose also, that is between distinct persons. Distinct persons means like 2 registrations of the same person. Say for example, I have a registration in Tamil Nadu, I have a registration in Karnataka. Now I want to shift the balance from Tamil Nadu to Karnataka, cash ledger Tamil Nadu to cash ledger, somewhere Karnataka. I want to shift the balance. Can I shift the balance? Yes. Credit ledger we cannot shift the balances. Only cash ledger we can shift the balance from one registration to another registration, but these 2 registrations should be belonging to the same person. Also one more condition they are telling, that there should not be any pending liability for the transferor. Means I have electronic cash ledger balance in Tamil Nadu, some excess balance. Now I need to get it as a refund, and again I need to deposit in the Karnataka registration. Instead, I can shift the balance. For shifting of the balance, so I have to file PMT9, but I need to ensure that in Tamil Nadu there is no pending liability. Balance available in cash ledger can be transferred between distinct person using PMT9. However, transferor should not have any liability in the liability ledger. These are the points with respect to electronic cash ledger. Then credit ledger, refund from electronic credit ledger is possible only in 2 cases, that is inverted tax structure and 0 rated supplies. Already we have seen refund of ITC possible only in these 2 cases. Other cases refund is not possible. And refund to original source ledger was the discussion I have been making. Whenever I pay some tax in excess by mistake, only by mistake, on account of excess payment, on account of any account error, etc. So whenever there is excess payment of tax, when we claim the refund, that refund will come into the original source ledger in proportion to which it is paid. That's the example I was giving. 1 lakh I paid in that month. The liability what I have discharged for that month, 60% through credit ledger, 40% through cash ledger. Then from the excess amount also 60% will come into credit ledger, 40% will come into cash ledger. Then for giving refund into the credit ledger, they will be giving an order in PMT3. So total we have lot of forms in that. PMT1 is for liability ledger, PMT2 is credit ledger, PMT3 is for recredit into the electronic credit ledger. When there will be recredit into electronic credit ledger, first we claim the credit, thereafter we use the credit for payment of taxes, but we paid the tax in excess. So to get the refund of the excess tax, we will be getting the money into the credit ledger. Okay. And PMT4 is communication of discrepancies. Suppose if there is any mistake in the balances, so for that we need to make a complaint to the portal. That complaint to the portal is PMT4, communication of discrepancies. Then PMT5 is cash ledger, PMT6 is deposit challan, PMT7 complaint to the payment gateway through the portal in case money got debited from our bank account but not credited into cash ledger. PMT8 we don't have, but PMT9 we have. That PMT9 is for the purpose of transfer of balance from one cell to another cell, or cash ledger of one distinct person to another distinct person. Then there is one more form, PMT3A. What is the purpose of this PMT3A? We claim the refund of ITC erroneously. Erroneously means wrongly we claim the refund. So now this refund wrongly claimed will be recovered from us. Again I am repeating, ITC refund we have wrongly claimed in excess. Now this amount will be recovered from us. So when it is recovered from us, then it should be given back in the credit ledger now, because we claimed as refund from which ledger? Credit ledger. Means the balance in the ledger would have come down. Now when it is recovered from us, then again the balance in the ledger should increase. So for recredit into the electronic credit ledger, they will be using PMT3A. When the registered person claimed erroneous refund of ITC, upon payment of such refund along with interest and penalty, proper officer shall pass a order in form GST PMT3A for recredit into electronic credit ledger. Then next, balance in electronic credit ledger can be used only for payment of tax but cannot be used for payment of interest, penalty, fee and others. Also, balance in credit ledger can be used only for payment of FCM liability, not RCM liability, because RCM liability always should be paid out of cash ledger. Okay. Balance in credit ledger can be used only for payment of GST under FCM, but not payment of GST under RCM. That's the reason why, remember this computation, first you need to take gross GST payable under FCM. First you need to take gross GST payable under FCM, and thereafter we need to reduce input tax credit. Okay, input tax credit, we need to reduce input tax credit utilized, and then you need to add GST under RCM. Add GST payable under RCM. Then you will be getting net GST payable through electronic cash ledger. This is called as net GST payable through electronic cash ledger. So this will be taken as the number. Okay. First we need to take gross GST payable under FCM minus input tax credit utilized, then add, because you cannot use ITC for payment of GST under RCM. It so happens that we will be having some gross GST payable 40,000, but we have 50,000 ITC. We have 50,000 ITC, okay, and we have RCM liability 15,000. So now when you put this 50,000 for RCM liability also, the net liability will become 5,000. So you should not do that. First 40 how much you can utilize? 40 you can utilize, and this 15,000, even though you have sufficient balance for payment of this 15,000, but 15,000 you have to pay. And what is the excess balance in ITC carried forward? Excess balance in ITC carried forward is 10,000. So the 10,000 cannot be used for RCM liability. That's why you remember this template. First, gross GST payable under FCM minus input tax credit utilized, add GST payable under RCM, net GST payable through electronic cash ledger. Then balance available in electronic credit ledger may be restricted for utilization by proper officer. So for that purpose, we have two rules, rule 86A and 86B. Actually, one more point is also there, that is related to arrears of tax. I have some arrears of tax, and for that arrears of tax, now I am paying. So can I use credit ledger balance for payment of arrears of tax? That is, say this. So for the month of July 2022, July 2022, I have to pay some tax. Okay. So short payment of tax or non-payment of tax. Non-payment or short payment of tax. Short payment of tax. So that is somewhere like 1,50,000. At that time, my ITC balance was 0. I don't have. If I had ITC balance, I would have used at the time itself. So balance in ITC at that time was 0. I did not have. Then somewhere in July 2024, I got a demand order asking me to pay that 1,50,000. You got it? Demand order under section 73 or 74, okay, for payment of 1,50,000. For payment of 1,50,000. In which month? July 2024. And here the balance in ITC that I have is 1 lakh. The balance in ITC I have 1 lakh. Then how this ITC got created? So from this July 2022 to July 2024, in this period, this ITC of 1 lakh got created. Okay. So this was not there at that time. Now the question is, can we use this 1 lakh for payment of 1,50,000? Yes. So CBIC gave a clarification. What is that? So net balance I have to pay how much? GST payable is as per order. GST payable as per order is how much? 1,50,000 minus electronic credit ledger balance in ITC. I can pay using ITC. How much? 1 lakh. Then what is the remaining amount? The remaining amount is payable through cash ledger. Payable through electronic cash ledger 50,000. Even though this ITC got accumulated at a later point of time, I can use this ITC for payment of demand order. So ITC can be utilized for arrears of tax. Sir, then everyone will do this now, sir. Yes, but the twist is in a different place. That different place where the twist they have kept is interest payable on gross amount 1,50,000. So here, boss, you use ITC, no problem. You use ITC 1 lakh, no problem, which you accumulated at a later point of time. Congratulations, all the best for you. But interest you have to pay on what? Not on 50,000, 1,50,000. However, interest payable on gross liability. How much I used ITC? 1 lakh. Usually when there is a delay in payment of tax, interest is computed on net liability. But in this case, interest payable on 1,50,000 at 18% from This month is July 2022. July 2022 means what is the due date of 3B? 20th October 2022. 20th August 2022. 20th August 2022 till 20th August 2024. So till that time I need to pay interest. So anyhow government is at gain. They are collecting the interest on 1,50,000. That's why they are allowing us to use the balance in ITC which is accumulated at a later point of time. So what is the important point that you need to learn here is that the balance in ITC can be utilized even for payment of arrears of tax arising out of any demand order. Then next, whatever ITC that we have availed in credit ledger may be restricted for utilization by a proper officer. In two cases it can be restricted. One is under Rule 86A, another is under Rule 86B. In 86A what they are telling, this is after taking the credit into the ledger or before taking credit into the ledger? After taking the credit into the ledger. Before taking into the ledger itself there is some restriction, that is section 38. Even though supplier filed GSTR1, but it will come into our 2B under ITC not available. When it comes into our 2B as ITC not available, we cannot take the ITC. I am not talking about that. It came in 2B as ITC available, but thereafter the ITC gets suspended for a period of 1 year. In what cases it will be suspended? See this. ITC availed against an invoice issued by a supplier who is not in existence. Your supplier is missing. We don't know where he went. Supplier is missing. So supplier not in existence or not doing business from the place where he has obtained registration. Number 2, recipient is missing. Means they could not identify us. We are here only. They could not identify. Recipient is missing. So sometimes in Swiggy and all, when I order, he will be outside my house only. Sir, I am not able to find sir, like that he will tell. I will be telling my car is there, car number also I will tell. He say, no sir, there is no car sir. If he turn backside, it will be there. One day I went backside to him and I said, turn backside, I am here only. So sometimes people will find it difficult to get the address. Like that, they are not able to identify. We are here only. So recipient not in existence or not doing business from the place where we have obtained registration, or ITC availed without receipt of goods, or ITC availed against an invoice for which supplier has not paid tax to government. Who did not pay? That idiot did not pay. For that, what is my problem? My ITC already taken is removed. Invoice or debit note against which ITC availed is not in existence. What has happened? Invoice is missing. Okay. So if you maintain physical copy of the invoices, this problem will happen. Then in that case, the ITC will be disallowed for a period of 1 year, suspended for a period of 1 year. And thereafter, after 1 year, what will happen? If it is genuine ITC, it will be given back to you. Otherwise, it will be permanently disallowed. Okay. Upon expiry of 1 year from the date of restriction, the registered person shall be able to debit input tax credit so disallowed, subject to any other action that may be taken against that person. This is about 86A. So what are the 5 cases where 86A will be coming into picture? Rule 86A, supplier is not in existence or not doing business from the place where they have obtained registration. Recipient is not in existence or not doing business from the place where they have obtained registration. Or invoice is missing, invoice or debit note is missing. Goods not received but we have taken ITC. Supplier has not made payment of GST to government. Then there are some cases wherein ITC will not come in 2B itself, that we have seen in section 38. What is that? Supplier is a newly registered business. Supplier has defaulted in payment of tax and the default continues. Supplier liability in GSTR1 greater than 3B. Supplier has not filed 3B, or supplier ITC in 2B is greater than his, ITC in 3B is greater than his 2B, and supplier has to pay 1% of liability through cash ledger but he did not pay. In those cases, first of all, ITC will not come into our electronic credit ledger. Okay, then so I said I will connect all these points in one place, that is this place only. Say this. First we made some purchases. First we made some inward supplies. When we made some inward supplies, okay, it should come into our electronic credit ledger first. Credited, ITC credited to electronic credit ledger. ITC credited to electronic credit ledger. Thereafter, we will utilize it for payment of our liability. Okay, ITC utilized for payment of liability. Now, see what and all is happening. The moment inward supplies is there, it may come in 2B or it may not come in 2B. There is one more blockage here. What is that? Reflected in 2B, reflected in GSTR 2B. Now, any stage the ITC may miss. Okay, what is the stage? First stage where ITC will miss. Here. ITC may go. Why? Why it will not come in 2B? Why it will not come in 2B? Supplier not filed GSTR1 or supplier has reported incorrect details in GSTR1. Correct these two reasons. Supplier not filed GSTR1, not filed GSTR1, then it will not come in 2B. Then supplier not reported invoice in GSTR1. Correct. He filed GSTR1, but he did not report the invoice. Got it? Or supplier reported invoice in GSTR1 as B to C instead of B to B. Possible. Then also it will not come in 2B. Number 4, supplier reported invoice in GSTR1 but incorrect details. Okay, supplier reported incorrect details in GSTR1. Because of this reasons, ITC will be missed. Okay, now having suffered this many problems, at last it came in 2B. Again, when it comes in 2B, it will be coming under two places. What are the two places? ITC available, ITC not available. Why ITC not available? Because of the restriction in section 38. ITC available. Okay. Why ITC not available? Because of section 38. Section 38. What does section 38 says? There are some cases now that we have seen in section 38. That is what? Supplier is a newly registered business or supplier. Some situations we have seen. So because of that reasons. And so here, is it a temporary or permanent? Temporary. It's not permanently ITC not available. Right now ITC not available. In future we may get it under ITC available. So this is like a temporary exclusion. Temporary exclusion Again, it may come in future. It is right now a temporary exclusion. What are the cases? Supplier is newly registered. Then supplier not filed GSTR 3B. Supplier liability in GSTR 1 greater than liability in GSTR 3B. Supplier ITC in GSTR 3B greater than ITC in GSTR 2B. Next, so demand notice, okay, supplier defaulted in payment of taxes, and such default continues. Then number 6, supplier paid 1% of liability, supplier not paid 1% of liability through electronic cash ledger. So these 6 cases, ITC gone. Again, ITC is available, but it's temporary exclusion. Whenever it is available, it will come there. Means if my supplier has rectified its mistake, then it will come into my ITC. Okay, sir. Then wherever ITC is available, again, for taking into the electronic credit ledger, we have to do some things. What is that? For taking into electronic credit ledger, we have to do, what is that? Blocked ITC. Gone? Correct or not? Blocked ITC. Blocked ITC will be gone, and non-business purpose will be gone. So blocked ITC under section 17(5), then non-business purpose under section 17(1), then next minus exempted, correct, used for exempted supplies under section 17(2), that is gone, and thereafter we will be taking it into electronic credit ledger. Once we take into electronic credit ledger, by the time it gets utilized, why it will go? At this stage, why it will go here? No, that is after utilization. This is like reversal of ITC, rule 42, rule 43. After taking the credit, we do reversal, na? Minus reversal of ITC under rule 42 and 43. We need to reverse the ITC. Then suspension of ITC under rule 86A. 5 cases. 5 cases ITC will be suspended. What is that? Not in existence. Supplier not identifiable. Recipient not identifiable. Invoice missing. And one more case, one second, I forgot this. Blocked ITC non-business purpose exempted supplies minus conditions not satisfied under section 16. Section 16, some conditions are there na. You have not received the goods, or the time limit, depreciation under Income Tax Act. So because of conditions not satisfied under section 16. After this, someone take a screenshot of it and send it to Chechi. Supplier not identifiable, recipient not identifiable, then invoice missing, then goods not received, then one more case. What is that? Supplier not paid GST. Then one more thing, that because of that also it will be gone. That is rule 86B. You cannot use 1% of credit ledger, correct? So non-utilization of 1% of liability under rule 86B. So 1% of my liability I cannot use from the credit ledger. It is there in my ledger, but I cannot use it. Because of these cases, I cannot use the money for payment of my liability. Now, at last, I am utilizing it for payment of liability after this many filters. And even in Instagram also, this many filters we will not use for uploading photo here. And after it comes into the ITC utilized, then again one twist is there. What is that? Reversal of ITC if GSTR 3B not filed by supplier, so by September 30th of the succeeding financial year, correct? Reversal of ITC under section 41, read with rule 37A, for what? Supplier not filed GSTR 3B by September 30th, minus reversal of ITC under section 16, read with rule 37. What is this, sir? 180 days. 180 days. We took the ITC, utilized it, but we have not made payment to supplier within 180 days. So therefore, we need to reverse the ITC here. You got it? So because of this reason, even after utilizing it for payment of liability, the reversal may happen. Okay. So that is about this many things. Suddenly if you see that, you will not understand anything. Then look into the next one, restriction on utilization of amount available in the electronic credit ledger, rule 86B. To whom this rule 86B is applicable? If my turnover in a month exceeds 50 lakhs, then this rule 86B will be applicable. What is that they are telling? I have to pay 1% of my gross liability through electronic cash ledger, even though I have sufficient balance in the electronic credit ledger to pay. And while computing the turnover, we should take out exempted supplies, zero rated supplies, even non-taxable supplies. What we have is only 4: taxable, exempted, non-taxable, zero rated. Zero rated should not come, exempted should not come, non-taxable should not come. So what is left is taxable. So simply remember, taxable turnover exceeds 50 lakhs, then only rule 86B will be applicable. This 50 lakhs is in a month or in a year? In a month. And to whom it is not applicable? To their family members. Government department, public sector undertaking, local authority and statutory body. Because what's the point in getting money from one pocket to another pocket? New money should come. So due to that reason, so to them it is not applicable. And 3 more cases also it will not be applicable. Such person or proprietor or karta or managing director or any of its two partners has paid income tax of more than 1 lakh in last 2 years, means already they created a cash flow to the government in the form of income tax. So due to that reason 86B is not applicable. So don't pay 1% of your liability through cash ledger. If you have sufficient balance in credit ledger, you use it, no issue. Then second case, so who here? That person or its managing director or its karta or proprietor or any of its two partners has deposited income tax of greater than 1 lakh. Here deposit means it should be before deducting TDS, TCS and advance tax, that line. Tax on total income including surcharge and cess is there na? That. Before deducting advance tax, TDS, TCS. So that if it is greater than 1 lakh, it's okay. Because when you deduct advance tax, already you paid na? Means already you paid income tax of that advance tax or TDS, TCS. So that is also your tax only na? TDS, TCS paid by other person. So before that line. So that is more than 1 lakh in 2 years, both years. Then current year rule 86B is not applicable. Received a refund of unutilized ITC greater than 1 lakh in the preceding financial year. Already you have got the refund, you have got lot of accumulated ITC, from that only you are getting as a refund. Who will get refund of ITC? Only two people, that is zero rated supplies and inverted tax structure. Already they got lot of ITC, so that they are getting as a cash refund. Again no point in making them to pay 1% through like cash ledger, so that's why it is not applicable to them. Paid greater than 1% of the liability, so cumulatively calculated up to the month in the current year, so means already you have paid more than 1% so far. Therefore current month you are not required to pay anything through the cash ledger. So how to calculate this? Simple here. First you need to take in the numerator what is the total amount paid up to this month in the cash ledger, that is up to the previous month in the cash ledger, okay, in the current financial year. So total amount paid through cash ledger, electronic cash ledger, up to previous month in current year, divided by what is your total gross liability up to current month in current year, multiply with 100. If this is greater than or equals to 1%, current month rule 86B not applicable. Rule 86B not applicable for current month. Suppose if this is less than 1%, then rule 86B applicable for current month. Let's put it into numbers to understand this. One student is messaging, you are getting ads only about Tamil Nadu government. Not only you, everyone will get from Tamil Nadu government only, because recently Tamil Nadu government has spent lot of money on YouTube advertisement. Even at my home also lot of ads. I am not using YouTube premium. I am also conjuice like you only. Okay. So ads and YouTube, Tamil Nadu government ads only is coming, because they pumped in lot of money. Because this 2024 elections is so crucial. So DMK government won through YouTube ads only. Stalin, Davarare, like that. So through that ad only they won. And due to that reason they are spending. It's not my problem here. YouTube problem. Fine. So see this. Here from April 2024 to July 2024, from April 2024 to July 2024, gross liability is 200 lakhs and payment through electronic cash ledger is 4.5 lakhs. 4.5 lakhs. Next, for August 2024, gross liability is 50 lakhs and balance in ITC is 60 lakhs. Whether Rule 86B applicable for August 2024. This is how you will get a MCQ question. Now what you need to do is that first you need to check the percentage based on the formula. What is the total amount paid through cash ledger up to previous month in the current year? 4.5 lakhs. 4.5 lakhs divided by total amount. Total amount is what? Already 200 lakhs plus 50 lakhs. So what is that? 200 plus 50, 250 lakhs. So 4.5 lakhs divided by 250 lakhs into 100. How much that will come to? 1.8%, which is greater than 1%. Therefore, greater than or equals to 1%. Anything is okay. Therefore, Rule 86B not applicable for August 2024 and entire 50 lakhs can be paid through electronic credit ledger. Okay. So this is how you need to apply that point. So what are the cases where Rule 86B is not applicable? Number 1, central government, state government department, then local authority, public sector undertaking and statutory body. If deposited income tax greater than 1 lakh by any person or its karta or managing director or any of its two partners more than 1 lakh in 2 preceding years, and if the unutilized ITC refund is greater than 1 lakh in the preceding year or current year, cumulatively up to the month we have already paid 1% through cash ledger. So that is about Rule 86B. So we are moving on to section 50. Of course. So when the taxable turnover in a month does not exceed 50 lakhs also it is not applicable. But in this case the GST liability itself is 50 lakhs. Then definitely the turnover will be some in crores. So turnover, it's not liability, turnover. So GST liability in all these places itself is in lakhs. Then definitely turnover will be in crores only. In whichever month the turnover is less than 50 lakhs, for that month it is not applicable. So next month again turnover goes beyond 50 lakhs, that month it will be applicable, simple. Then there is one query here, 1 second. Sir, instead of deficiency memo, if we get rejection order in GST RFD 6, later then we file the refund claim to rejection order, time will be excluded or not for 2 years? No, it will not be excluded. Once they reject the refund, so then again when we make the new application for refund, we don't have any provision like exclusion from deficiency memo to refund application, like that we don't have any provision. So because of which the time will be gone. So again when you are making a new application, for that new application you check the time limit. Is it within 2 years or not? If it is beyond 2 years, the new application cannot be made. Okay. Then coming back to this section 50, interest on account of delay in payment of tax. There are 3 situations where the interest will be applicable under section 50. First, there is a delay in filing 3B. Because of delay in filing 3B, there is a delay in payment of tax. So because of which interest will be applicable. Second, invoice not reported in GSTR 1 and GSTR 3B but paid in a different month. So this is non-payment or short payment of tax. We have to pay tax in that month. We did not pay, at a later point of time we paid. The difference between first situation and second situation is that first situation we have shown the liability, but 3B filed late. In the second situation, we did not show the liability, we skipped it, and in a later month we are showing that as a liability. Situation 3, wrong availment and utilization of ITC. You are not supposed to take the credit, you took the credit and you have utilized that ITC. So in these three situations, section 50 interest will be applicable. Let's see the first situation. Delay in filing 3B. Interest rate is 18%. From when it should be computed? From the due date till the actual date of payment. Don't count the due date, count the next date. For example, July month, due date is 20th August. While interest computation, don't count 20th August, you count from 21st August till the date you are making or filing the GSTR 3B. So from the first date after due date till the actual date of payment. And it will be computed on what? Is it computed on the gross liability or net liability? It will be computed on the net liability. So on amount paid through electronic cash ledger, that is net liability, it will be taken. Then what will be considered as the date of payment? Date of payment is nothing but the actual date of filing 3B. Then second, situation 2. Invoice not reported in GSTR1 and GSTR 3B of a month but paid in the other month. So in this case, interest will be computed at same rate, 18%, again same date, from the first date after due date till the actual date of payment. But interest is not computed on net liability, interest is computed on gross liability. That's the example we saw, entire 1,50,000, arrears of tax 1,50,000, even though we paid 1 lakh using credit ledger and 50,000 using cash ledger, but interest is computed on entire 1,50,000, that is gross liability. And till when it will be computed? What will be considered as the date of payment? Either actual date of filing 3B, through 3B also we can pay, or through DRC 3 also we can pay. So therefore, if payment is through DRC 3, then the date of filing such form. Then situation 3. Situation 3 is ITC wrongly availed and utilized. Suppose if we have wrongly availed the ITC, but we have not utilized that ITC, then we are not required to pay any interest. So interest will be at the rate of 18% from the first date after utilization of ITC till the date of reversal. And this computed ITC on ITC utilized only, not on ITC availed. So interest same 18%, not 24% interest. In some places they are telling 24% as the interest. No. So as per Finance Act 2023, so clearly it is mentioned that the interest is at the rate of, not Finance Act 2023, 22 itself, correct. 22, clearly it is mentioned as 18%. So in the law they use the word not exceeding 24%. Not exceeding 24 does not mean 24%. Not exceeding 24, but the rate is 18%. So 18% is only correct. 18% from the first date after utilization till the date of reversal. Now we need to compute interest on what? Only on ITC utilized, not on ITC availed. How to know ITC utilized? That month in which the balance in ITC falls below the availed ITC. In that month we have utilized the ITC. The extent to which balance in ITC falls below availed ITC. And what will be considered as the date of utilization? Date of utilization is actual date of 3B or due date of 3B, whichever is earlier in the month in which the balance in ITC falls below wrongly availed ITC. Whichever is earlier with respect to the month in which balance in ITC falls below wrongly availed ITC. And the date of reversal will be taken as the actual date of 3B. So this is how interest will be computed under section 50. And here on ITC wrongly availed and utilized, so we may get a question like this, that is balance in, that is ITC wrongly availed, ITC wrongly availed in July 2023, 1,50,000. Compute interest based on following table. Based on following table. So here month, opening balance, ITC availed, then ITC utilized. So we need to prepare a table like this based on the data in the question. Then closing balance. Now month, say July 2023. So we have an opening balance of 1 lakh ITC availed 3 lakhs. In this 3 lakhs, 1,50,000 wrongly availed. 1,50,000 wrongly availed. And ITC utilized this, so somewhere like 2 lakhs. So what is the closing balance? 3 plus 1. So 2 lakhs is the closing balance. So whether we utilized for ITC wrongly availed? No, we have not utilized. Again, August 2023, opening balance 2 lakhs and ITC availed is 3 lakhs. IT is utilized 4 lakhs and balance will be 1 lakh. Whether we have utilized the ITC? Yes. To what extent we have utilized? 50,000 we have utilized. Again, September 2023, opening balance 1 lakh and ITC avail is 4 lakhs and IT is utilized 2,50,000. So what is the balance that we have? 2,50,000. So again it has increased, which means whatever we have utilized, we reverse. No, not like that. Not like that. That is not the meaning. So when the balance comes down, we utilize. But again when the balance increases, it does not mean we reversed. Okay. Then actually we should have reversed. Actually we should have reversed means for reversal there is a separate place in GSTR 3B table 4 and there it should have been shown. So October 2023, 2,50,000, ITC wrongly availed 1 lakh and ITC has been utilized. So 2,50,000, sorry, 3 lakhs we have utilized. So when 3 lakhs we have utilized, so it came down to 50,000. Then again 50,000 we have utilized in the month of October, and in November 2023, 50,000 we availed 5 lakhs and we utilized. So 2,50,000 including 1,50,000 wrongly availed. So whatever we have wrongly availed, we reverse only in this stage. So 5,50,000 minus 2,50,000, 3 lakhs is the closing balance. Now in this case, if you see what has happened, so we have availed ITC wrongly 1,50,000 and that got utilized 50,000 utilized in August. Whichever month the balance in ITC falls below wrongly availed ITC, in that month we have utilized. Again, so total 1,50,000 we utilized 50 here because the balance came to 1 lakh. Again where the balance is coming down below 1 lakh. 1,50,000 wrongly availed, balance 1 lakh means 50 we utilized. So now wrongly availed ITC 1 lakh. Where it is going below 1 lakh, again in October it is going below 1 lakh. So here also we are utilizing 50,000. Now there are two interest computation. So first interest computation is on 50,000 at what rate? 18%. From which date to which date? This 50,000 we have utilized for which month? August 2023. For August 2023 we need to take due date of 3B or actual date of 3B, whichever is earlier. So let's take 20th of September 2023 to when are we reversing it? November. For November, when we will file the GSTR 3B? 20th of December 2023 divided by 365 days. So that will be 50,000 into 18% into number of days. Can you calculate? 29 to 2012. So in September you take 10 days, October 31 days, November 30 days, December 20 days. So how many days interest will be computed? 91 divided by 365, that will be equals to 50,000 into 18% to 91 by 365, 2,244. Again there is another interest that will be possible here. That another interest is on again 50,000 into 18%. This will be computed for October month. For October month, when are we filing 3B? 20th of November to 20th of December 2023 divided by 365. So that will be 50,000 into 18% into number of days. 20th November to 20th December means how many number of days? 30 days. 30 divided by 365. So what is the amount? 740. These are the two interest amounts that we need to pay in this case. So this is how you may get a question. Then there is one more point which you should be knowing, that is, suppose if I have the balance in the respective head. That is, in the respective head I don't have the balance, but total against all these three heads I have sufficient balance. Does it mean whether I have utilized the ITC? What is this situation? IGST wrongly availed. IGST wrongly availed 1,50,000. IGST wrongly availed 1,50,000. Okay. And if you see for Jan 2023 and reversed in April 2023. Now January, February, March, if you see CGST balance, CGST, SGST, IGST and total. So balance in CGST is 40,000, SGST 40,000 and IGST 60,000. So we have got 1 lakh. So we have got 1,80,000. Again February month, so 30,000, 30,000 and 90,000. So 1,50,000. And March month 50,000, 50,000 and 60,000. How much? 1,60,000. Now if you see IGST head alone, 1,50,000 wrongly availed. So 50,000 we utilized in January because the balance in ITC under IGST is 1 lakh, means 50,000 we utilized. Again it came down to 90, means 10,000 we utilized, correct? Again it came down to 60, means we have utilized 40,000, correct? As per IGST head alone, if you see only IGST head alone, if you don't see anything else, only IGST head alone, if you see 1,50,000 came down to 1 lakh, means 50,000 we utilized in Jan. Again it came down to 90, means we utilized 10,000 in Feb, and again it came down to 60, which means we utilized 30,000. Already it came to 90, so 90 to 60 will be 30,000. We utilized 30,000 in March. But if you see the total, so total if you see, every month we are maintaining 1,50,000 we are maintaining if you see total wise. Now whether ITC is utilized or not utilized, ITC wrongly availed is utilized or not utilized? Not utilized. As per CBIC circular, ITC of IGST wrongly availed is not utilized, as there is balance in total ITC for each month till reversed. So means we don't have to check only the headwise. You see the total. If the total ITC you are maintaining, that is sufficient. Not necessary that headwise you need to see this point. Okay. Then suppose instead of CGST, SGST, IGST, I have got compensation cess. Then in that case, what will be the treatment? So assuming the same scenario. So whatever scenario that we see here, instead of calling it as CGST, SGST, okay, instead of calling it as CGST, SGST, cess, everything remains the same. So 80,000 and in February 60,000 and in March 1 lakh. Okay. Now in this case the total is maintained. So whether we have maintained the balance, no, cess don't see, compensation cess don't see, you see only IGST, because if the compensation cess is there, that should not be taken. You have to see only the IGST head here, so that is remaining other than compensation cess. What is remaining other than compensation cess? Only IGST. So therefore, rupees 50,000 utilized in Jan, comma, rupees 10,000 utilized in Feb, and rupees 30,000 utilized in March, and entire 1,50,000 reversed in April 2023. So accordingly we need to compute the interest. So therefore this particular amendment I have given at the end, you can see last clarification on charging of interest under section 53, that is wrong availment and utilization of ITC in case of wrong availment of IGST credit and reversal thereof. What is the first point they are telling? In the case where IGST credit has been wrongly availed and subsequently reversed on a certain date, but reversal should be IGST only, reversal should not be CGST, SGST, reversal should be IGST only. There will not be any interest liability under section 53 if during the time period starting from such availment and up to the date of reversal, the balance of ITC in cash ledger under the heads of IGST, CGST and SGST taken together. So what is that? The balance in ITC, under the heads of IGST, CGST taken together. The balance of ITC in the electronic credit ledger under the heads of IGST, CGST, SGST taken together has never fallen below the amount of such wrongly availed ITC, even if the available balance of IGST credit in electronic credit ledger individually falls below the amount of such wrongly availed IGST credit. So that is the example we have discussed. So refer notes. So I have discussed this one example, ditto, whatever I have given there, that circular is there, that is this example. So they can definitely test this in exam. It's very important point. So chances of asking is there. And then another point you see, credit of compensation cess available in the electronic credit cash ledger cannot be taken into account. Compensation cess cannot be taken into account. So if you have compensation cess while doing the total, don't take compensation cess. Considering the balance of cash ledger for the purpose of calculation of interest under rule 88B in respect of wrongly availed and utilized. So this also we have seen. Suppose if you have compensation cess, don't take that in the total. In the total you should take only IGST. Here we don't have CGST, SGST. Had we had CGST, SGST, that we would have taken. Sir, this circular is given in the context of IGST. Does it mean for CGST, SGST, this circular is applicable or not applicable? So they have not given any specific point for this. You know why for IGST they gave? Because IGST credit can be utilized for payment of CGST, SGST liability. That's why they gave. But CGST, SGST credit also can be utilized for payment of IGST. Na? Means logically the principle laid down in this circular can be applied even for CGST, SGST, IGST. So whenever you wrongly avail any credit, CGST credit, SGST credit or IGST credit, ensure that you are having the total column ITC which is balance maintained. If you maintain the balance, you don't have to pay the interest. That is with respect to this. Okay. Next. So this is related to the interest computation there under section 50 subsection 3. So come back, see the other aspects. Then look into TDS and TCS, page number 126. So query here. Sir, then in case of wrong availment of IGST, can we reverse CGST and SGST in the given example? No, IGST only we need to reverse. Then how we should find the utilization of ITC wrongly availed on GST compensation cess? Is it to be checked with total balance or only ITC of compensation cess? Only on ITC balance of compensation cess we need to see. We should not see the total, because compensation cess cannot be utilized for payment of credit of compensation cess, cannot be utilized for payment of any liability. So we need to see only compensation cess head. Then TDS and TCS under GST section 51 and 52. So TDS is basically applicable whenever we are making supplies to notified recipients. Who are called as the notified recipients? Government, central government, state government, union territory and local authority, government agency, public sector undertaking, or government entity in which government has invested greater than or equal to 51%. So then they are called as notified recipients. If any supply of goods or services are made to these notified recipients, they will be remitting some amount. In that amount, they will be deducting TDS. Whereas when TCS will be applicable, whenever we are making supplies through e-commerce operator, where e-commerce operator is not liable to pay GST on the transaction, means other than 95, then in that case e-commerce operator, while remitting the money to the supplier, he will be deducting TCS. So supplier should be different from the e-commerce operator. Suppose if I am the supplier, I have my own e-commerce platform through which if I am making supplies, TCS will not be applicable, and therefore only when the supplier is different from the e-commerce operator, then only TCS will be applicable and e-commerce operator will deduct the TCS. Then next, who is liable to deduct at what rate? TDS, who is liable to deduct? Notified recipients. What is the rate at which they will be deducting TDS? 2%. And TCS, e-commerce operator. And what is the rate of TCS? 1%. And non-applicability. So TDS, these are the cases where TDS is not applicable. Already November 23 exam, they have asked a question, 4 marks question on this. What are the cases where TDS is not applicable like that? Supplier is an unregistered person. Logically, because whatever TDS that is being deducted, it will be made available to the supplier in their electronic cash ledger and they can utilize for payment of their liability. Basically, when he is unregistered, why he will be having an electronic cash ledger and liability? So due to that reason, TDS is not applicable. Supplies are exempted or non-taxable. Again, supplier don't have any liability, so there is no question of TDS that is applicable. Then contract value does not exceed 50,000. Contract value, not invoice value. So total value of supplies under the contract does not exceed 2,50,000. TDS concept not applicable. If the total value of supplies under the contract exceed 2,50,000, TDS applicable, but TDS is not computed on the contract value. TDS will be computed on the remitted amount, whatever money that is being remitted by the recipient to the supplier on that. Then supplies between notified recipients. Who are the notified recipients? Central government, state government, local authority, government agency, PSU or government body. Between them, if there is any transaction, PSU to government body or government body to central government, like that, if there is any transaction, on that TDS is not applicable. So supplies between notified recipients, TDS not applicable. And recipient liable to pay GST under RCM. So then also TDS not applicable, because the liability to pay GST itself is on the recipient. Then what is the point in making the GST like TDS applicable to the supplier? Then next, location of recipient and the place of supply not in the same state. It's an intra-state supply. Intra-state supply chargeable to CGST, SGST, but the recipient is in the other state. He cannot deduct TDS. For example, government of Andhra Pradesh is having a building in Telangana. They appointed an architect in Telangana to do the repair to this building. So supplier architect Telangana and place of supply location of immovable property Telangana. It's an intra-state supply chargeable to CGST and Telangana SGST. But government of Andhra Pradesh is in another state. They cannot deduct TDS 1% towards SGST. Due to that reason, TDS is not applicable. So what is that? It's an intra-state supply and the recipient is located in the another state. TDS not applicable. These are the 6 cases where TDS is not applicable. Whereas if you see here TCS, TCS is applicable in case of e-commerce operator. However, for TCS also there are some non-applicabilities. What is that first non-applicability that we know? If it is a notified service under 95, TCS is not applicable. Here also same point. If the supplier is unregistered, TCS not applicable, because whatever TCS that is deducted by the e-commerce operator will be made available to the supplier and the supplier can use it for payment of liability. When the supplier is unregistered, there is no cash ledger. Due to that reason, TCS not applicable. Supplies are exempted or non-taxable, same. as the supply itself is exempted or non-taxable, there is no question of TCS. Then payment is not collected by e-commerce operator, means payment is directly collected by the supplier, so e-commerce operator cannot deduct TCS. Then TDS is computed on the amount remitted to the supplier by the recipient. Remember, it's not on the contract value. How much amount the remittance is made, on that only TDS is computed. TDS not applicable if it is an intra-state supply and the recipient is in the other state. Then there are some special procedures applicable here. So there is a supplier who is opting for composition scheme and he want to make supply of goods through e-commerce operator. Can he make supply of goods through e-commerce operator? Yes. So in that S9 RCM, supply of services through e-commerce operator is only the restriction. Supply of goods through e-commerce operator can be made. But that supplier has to ensure one thing. What is that? He should not make interstate supplies. Can opt for composition scheme but should not make interstate supplies. Also, e-commerce operator has some obligations. What is that obligation? They should ensure that the supplier is not making interstate supplies. So this point we discussed in composition scheme. Now this point is there in this chapter, like they have an obligation, like they should not allow the supplier to make interstate supplies. And whether TCS will be applicable or not. Yes, even the person opting for composition scheme is also a registered person. So therefore TCS will definitely be applicable. And this TCS will come in their credit ledger or cash ledger? Cash ledger. So they will not have credit ledger. Why a person opting for composition scheme will not have credit ledger? Because they cannot take ITC and their invert supplies. So it will anyhow go into their cash ledger and they can use it for payment of their composition tax liability. So 1% or 5% as the case may be. So should deduct TCS. And all these details should be declared in GSTR 8. GSTR 8 is a return to be filed by the TCS deductor, that is CMP 8. CMP 8 is to be filed by 18th of the month following every quarter by composition scheme. GSTR 8 is a return filed by a person who is deducting TCS, that is e-commerce operator. What is the time limit for GSTR 8? 10th of the month following every month. TDS deductor will file GSTR 7. Okay. Now, another point you see, there is a supplier who is unregistered and that person wanted to supply goods through e-commerce operator. Kindly change it to goods. So there is a supplier who want to supply goods through e-commerce operator. Before amendment, every supplier of goods through e-commerce operator was compulsorily required to get registered. But now there is a relaxation. If that supplier is making only intra-state supplies, then he is required to get registered only when his aggregate turnover exceeds threshold limit. So supplier is unregistered whose aggregate turnover not exceeded the threshold limit for registration. However, the supplier should obtain one unique enrollment number, correct or not? And obtaining unique enrollment number only, he can make supplies through e-commerce operator. Now, what are the obligations on this e-commerce operator? E-commerce operator should ensure that the supplier has obtained the UEN and then only they should allow these supplies through their platform. Number 2, e-commerce operator should not allow that supplier to make interstate supplies. TCS not applicable. Why TCS not applicable? Because that supplier is a unregistered person. So not required to deduct TCS. Not required to deduct TCS and they should declare these details in GSTR 8. Sir, when there is no TCS, why they need to show no non-TCS supplies, like that one line is there, in that they need to show in order to know that what are the turnover of this unregistered supplier which is made through e-commerce platform for purpose of computing the aggregate turnover of the supplier. Okay, so this are with respect to this additional obligations on the e-commerce operators. Then look into the next page. Computation and compliance. So TDS under section 51 is computed on value of supply excluding GST, and whatever TDS that is deducted shall be payable to government, and TDS deductor is required to file one return. What is that return? They need to file GSTR 7 and that GSTR 7 should be filed by 10th of the month following every month. In addition to this TDS deductor is also required to file a certificate, that is GSTR 7A, and there is no time limit for this TDS certificate. Whereas TCS, if you see, TCS deductor, while computing the TCS, they need to take whatever is the payment towards the contract value minus returns during the month. So sales return should be excluded because in e-commerce platform there will be lot of returns. So sales made during the month minus returns during the month that should be taken for computing the TCS, and whatever TCS that is deducted will be payable to government, and they need to submit a statement in GSTR 8. TDS deductor GSTR 7, TCS deductor GSTR 8. What is the time limit? Same time limit, 10th of the month following every month. And TCS deductor is not required to give any certificate. Then, is there any late fee for delay in filing TDS and TCS return? Yes. In case of TDS return, see the late fee, 25 rupees per day subject to maximum 1000. Why? Government. Whereas in case of TCS, 100 rupees per day subject to maximum 5000. Why? Private. So government is filing this return, so lesser late fee, 25 rupees per day subject to maximum 1000. This is under each act, means under CGST Act we need to pay as well as SGST Act we need to pay. Whereas TCS, late fee for delay in filing return 100 rupees per day subject to maximum 5000 under each act. TDS operator, TDS deductor is not required to file any annual return, but TCS deductor is required to file annual return GSTR 9B by 31st December of the succeeding financial year. And in both the cases, if there is any delay in payment of TDS TCS, they need to pay interest at the rate of 18% for the delay. Here the due date will be counted from 10th, not 20th. And even a general penalty can also be levied, which is up to 25,000 under CGST and up to 25,000 under SGST for non-compliance. And there is a specific penalty for TDS TCS default, which is under 122 subsection 1, that is 100% of the TDS TCS involved or 10,000, whichever is higher under each act. Now whatever TDS TCS that is deducted by the notified recipient and the e-commerce operator will be made available to the supplier in their GSTR 2A. So TDS TCS deducted shall be reflected in 2A of the supplier, which is reflected in electronic cash ledger. As the money goes into cash ledger, they can use it for payment of any liability, tax, interest, penalty, etc. And TCS return, GSTR 8 alone can be rectified. GSTR 7 cannot be rectified, but GSTR 8 can be rectified. What is the time limit of rectification? 30th November of the succeeding financial year or date of filing and return, whichever is earlier, just like time limit for availment of ITC. Then this is an illustration on TCS as to how TCS will work. There is a supplier, MI Mobiles, e-commerce operator Flipkart, and there is a buyer. So now what happens is that first MI enters into contract with Flipkart to list their mobile in their platform and sell it for a commission of 1000 rupees plus GST 18%. Now buyer will place an order with e-commerce operator and e-commerce operator will deliver the mobile and the buyer will make payment of 12,800 rupees. So here invoice will be raised by MI to e-commerce operator. They will deliver the mobile along with GST 10,000, 28%, 12,800. So that 12,800 is collected from the buyer. Now e-commerce operator has got 12,800. Out of this 12,800, what is that they will be deducting? So first they will be remitting their TCS. What is the TCS? 1%. 1% of what? Including GST or excluding GST? Excluding GST. So 10,000 into 1%, they need to pay TCS 1% of 10,100. Plus they also get a commission. On that commission they need to pay GST. So 1000 into 18%, 180. So these two they will pay. Now how much will be the amount remitted? 12,800. From this 12,800 they need to get the commission. So minus 1000 minus GST on commission 180 minus TCS 100. So the remaining amount will be remitted to the supplier. That is this amount remitted. So that is 11,520. Now the supplier, this 180 can be taken as ITC and this 100 rupees can be taken as TCS credit. And the supplier has to pay a liability of 2,800 na. On the 2,800, this 180 and 100 can be reduced. So 2,520 will be the net liability. So this is how the TCS will be operated. Then one more important point you remember, TCS deductor is required to register in every state. So because if the supply is intra-state, the TCS deductor has to deduct 0.5 CGST, 0.5 SGST, which means supplier in Tamil Nadu, recipient also Tamil Nadu. But the e-commerce operator is in Karnataka. Now they need to remit 0.5 CGST and 0.5 SGST in Tamil Nadu. Means they need to register in Tamil Nadu. Means e-commerce operators will register in every state where they have suppliers. And in case when they are required to register, do they require to have a physical place of business? No. So in REG 1, that is registration application, part A, they will mention the state where they want to register. In part B, they will give their principal place of business address only. That is Karnataka address only they will give. But in Tamil Nadu, they can get the registration. This facility is given for TDS and TCS deductor. So these are the points that we have with respect to payment process. Okay, so we completed this, and so there are two queries. No. Fine. And one communication to you, one small request, that is, actually no, both my kids are not feeling well and I have to be there, so I don't wanted to cancel this batch, that's why I took for 3 days. So I need 1.5 day and half a day for discussion of Mighty 50. So I will take a break and I will let you know which 2 days, and in those 2 days I will complete the remaining portion including customs and Mighty 50. Is it okay? Done? But that will not be some time long and all. Mostly by 23rd, 24th, like that, just a gap of some 5-6 days. Thereafter I will do this. Okay, sorry for the inconvenience, even for YouTube also. And so remaining chapters, whatever we have, plus customs, we have some petty topics only in this, plus customs we have, and then Mighty 50 questions. That Mighty 50 questions I will give you as to what are those questions. A PDF I will make it available to you. You can take a print of it if you don't have the solved workbook. If you have the solved workbook, it will be from the solved workbook only. Otherwise, if you don't have, you can take a print of it. So that also we will be covering. Just 2 more days is required. I'll cover there. Okay, fine. So now we will proceed to the next area, that is returns under GST. Okay, say this. So returns under GST. So first we have what are the various returns and what is the due date of filing each and every return we need to know. Then the late fee computation we need to know, and then QRMP scheme. But QRMP scheme, interest computation, is a long time pending question that can be tested. So first we will see about QRMP. What is QRMP? Quarterly return, monthly payment. So to whom this QRMP will be applicable? To a person whose aggregate turnover in the previous year does not exceed 5 crores, to them QRMP scheme will be applicable. And as they are required to file the returns on a quarterly basis, so what is the due date of that quarterly return? GSTR1, usual time limit is what? 11th of the month following every month. Whereas in case of QRMP, it is 13th of the month following every quarter. Then GSTR3B, due date, usual due date is what? 20th of the month following every month. But under QRMP, GSTR3B due date is 24th of the month following every quarter. In case of states other than GMCA and states below that, for remaining states it will be 24th. But for GMCA, G for Gujarat, in India map you see the middle states, Gujarat, Madhya Pradesh, Chhattisgarh and Andhra Pradesh, and states below that. States below that is what? Maharashtra, Karnataka, Kerala, Tamil Nadu, Puducherry, Goa, etc. For these places, even Telangana also, it will be 22nd. For the states above GMCA, so northeastern states, north states, etc., it will be 24th. Okay, so GSTR1 will be filed on a quarterly basis by 13th of the month following every quarter, and GSTR3B on a quarterly basis by 22nd or 24th of the month following every quarter. And they have to pay tax on a monthly basis. Even though returns they file on a quarterly basis, but tax they have to pay on a monthly basis. They have 2 methods, fixed sum method and self-assessment method. This fixed sum method or self-assessment method they can choose for every month. Like in the quarter, first month FSM, second month SAM, they can choose, and all 2 months they can choose FSM, all 2 months they can choose SAM, so they can choose anything, but they have to pay tax. By when they have to pay? 25th of the month following every month for the first and second month of the quarter. Why not third month? Anyhow, for all these 3 months, they will be filing GSTR3B. In the GSTR3B, they will be paying the liability of the third month also. So, first month and second month liability, they have to pay by when? 25th of the month following every month. monthly payment of tax through PMT6 using fixed sum method or self-assessment method by 25th of next month for 2 months in a quarter. And with respect to their B2B supplies, so with respect to B2B supplies, as they are filing returns on a quarterly basis, their recipients will take ITC also on a quarterly basis. To avoid that, they have been given a facility to file on a monthly basis the invoice details. So that invoice details they will be showing. Which invoice details? B2B or B2C? B2B invoice details they will be showing in one facility. What is the name of that facility? Invoice furnishing facility. By when they need to file that facility? For the first month and second month in the quarter, by 13th of the next month. What about third month? Anyhow, for all these 3 months, they will be filing a GSTR1. So in that GSTR1, they can show the details. Okay. B2B invoices may be furnished on a monthly basis through invoice furnishing facility, and these details will be reflected in 2A and 2B of the recipient. And QRMP scheme is basically GSTN wise. It's not like in composition scheme, all in all out. All the registrations of a person should be under composition scheme, or all the registration should be under normal scheme, not like that. So QRMP is GSTN wise, means each and every registration of a person, they can choose whether to go for QRMP or to continue in the normal monthly returns itself. QRMP is GSTN wise, and distinct person have the option to avail the scheme for one or more GSTIN. Then some additional points related to this. What is the time frame for opting in QRMP? So remember, A for after, B for before. One is A is 1 is 1 month, 2 is 2 months. So 1 month before start of the quarter, 1 month after start of the quarter, and 2 months before start of the quarter. For example, April to June. What is the start of the quarter? April 1st. 1 month after April 1st means April 30th. 2 months before April 1st, that is 1st February. So that is the time limit by which they need to opt. So 1 month after commencement of the quarter, 2 months before commencement of the quarter, they should decide for opting into QRMP. What is the condition for opt-in? Last return must have been furnished on the date of exercising the option. Because if you have monthly returns pending, you cannot go for QRMP. All those monthly returns should have been filed, then only you can go for quarterly returns. Then GSTR1 or availing IFF facility. Is QRMP mandatory or optional? QRMP itself is optional, but in that QRMP, IFF is another option. You understood? QRMP itself is optional. In that, whether you want to file the invoice details, B2B invoice details or not, is again an option. So you can decide for either filing GSTR1 and showing all the invoice in GSTR1, or you can file for the first month and second month invoice furnishing facility for showing your B2B supplies. The scheme provides the IFF facility for first 2 months to furnish the details of outward supply till the 13th of the succeeding month, and this facility is optional. And whatever details which are furnished using IFF facility need not to be required to be refurnished in GSTR1, because already we showed these details. It will be carried forward in GSTR1. What is the disadvantage of not going for IFF? All these details again we need to enter in GSTR1. Then next there is a restriction here. Maximum 50 lakhs worth of invoices only can be shown. 50 lakhs value, not tax. 50 lakhs value of invoices can be shown in IFF, because the logic is 50 lakhs in 1 month. On an average they are doing. So we have 5 crores. If you cross 5 crores, you cannot go for QRMP na. 5 crores. 5 crores is for 1 year. So divided by 12 months, so 46.67, they rounded off to 50. But they are taking the assumption that the turnover will be evenly spread throughout the year. Why it will be evenly spread? It may change, but they gave this exception. The details of outward supplies shall not exceed the value of 50 lakhs in each month. On non-opting of this facility, details of outward supply to be reported in GSTR1. And payment method. What are the 2 payment methods that are there? Fixed sum method and self-assessment method. In fixed sum method, we will be taking, like last quarter GSTR3B. In that last quarter GSTR3B, we will be taking, so into 35%. Why? Last quarter 3B means that is for 3 months. 3 months divided by 3, 33.33, rounded off to 35, means this month first month in this quarter, you pay 35% of the liability of last quarter. And second month also pay 35%. What about third month? Anyhow, you pay the actual liability. So 35% of the previous quarter, gross liability or net liability? Net liability, not gross liability. Net liability, you need to discharge as your liability under fixed sum method for the first month and second month in the current quarter. Suppose if you go for self-assessment method, you calculate how much is your actual liability and you can make the payment. Sir, I am under fixed sum method. Previously, I was not under QRMP. I was under normal. Then monthly 3B liability is there. 100% of that 3B liability, monthly 3B liability I will pay for this month. Assumption is what? Whatever was your liability of previous month, that will be taken. Sir, what if my previous month liability is 0? Then 0. It is advantage to go for FSM. Really, it's an advantage to go for FSM because previous month into 100% or previous quarter into 35% is 0. So we don't have to pay anything under fixed sum method. Means beginning of the registration, when you go for QRMP, it's really advantageous. But this advantage we cannot enjoy for more quarters, first quarter only. Again, first quarter some actual liability will be there na, that will be taken as the precedence for the second quarter. So 35% of the tax liability in cash paid in the preceding quarter, if it is quarterly filer of GSTR 3B, whereas monthly filing of GSTR 3B, 100% of tax liability in cash paid in the last month of the preceding quarter. Whereas in case of self-assessment method, so I told you, normally we need to compute actual liability. How much is our gross liability? How much is our ITC? That much we need to pay. Then sir, we can go for self-assessment method. How much ever money we want, we can put it now, sir. The disadvantage is that if there is any difference in the liability, because of self-assessment method you opted and you paid some 10,000, but your actual liability is 15,000. This difference 5,000 is there na. On that 5,000 you need to pay interest. Had it been fixed sum method, under fixed sum method it is 10,000, you paid 10,000, but your actual liability is 15,000, on that 5,000 we don't have to pay interest. That is the advantage of fixed sum method. If you follow what Chechi says, no interest. If you follow something on your own, interest you have to pay. You understood or not? What is that Chechi is telling? You take previous liability into 35% or into 100%, that only you take. So government is telling something, you follow that. If you follow that, no need to pay any interest on the difference amount. If you follow something on your own, you pay the interest, no other go. That is this. Any change in the manner of filing GSTR 3B? No. The manner of declaring the tax on outward and inward supplies are same, but the tax paid in the first 2 months would now be offset along with the third month liability. So that is the only change. Then compulsory opt-out. So when the aggregate turnover exceeds 5 crores in any quarter, because what is the limit for QRMP? 5 crores na? First quarter 3 crores, yeah? Second quarter 3 crores. So 3 plus 3 is what? 6 crores. Means you crossed 5 crores. So third quarter you cannot go for QRMP, you need to file on a monthly basis only. Levy of late fees. Yes, late fee will be applicable for delay in filing returns. So here also there is returns na, GSTR 1 and GSTR 3B. That is only considered as returns. IFF is not considered as return. For delay in filing IFF, there is no late fee. Only for this GSTR 1 and GSTR 3B, the late fee will be applicable. Now, look into this interest computation. Interest computation only very important, that can be tested. So, first we will see under fixed sum method. Under fixed sum method, we need to pay interest at the rate of 18% per annum from 26th of the month till the date of payment if there is a delay in payment of any tax pertaining to the first month and second month. For example, so July to September, we are under QRMP, and for the month of July, for the month of August, and for the month of September, we need to pay some taxes. And during April to June, we were under QRMP, and during this April to June, in our GSTR 3B, net liability came to 1 lakh. Net liability 1 lakh. So July month, how much is the FSM liability that I have to pay? 35,000 I have to pay, and again August month I have to pay FSM liability 35,000, and this 35,000 I have to pay by when? I have to pay by 25th of August, correct? If I pay it late, which one I pay late? July month, if I pay late, then I have to pay interest. From when I have to pay interest? 26th August I have to pay interest. At what rate? Usual rate of interest, 18% till the actual date of payment. Same way, August month 35,000, by when I should pay? I should pay by 25th of September. If there is any delay beyond the 25th September, then I have to pay the interest. So please check the first point. For the first 2 months, if there is any delay in payment, so we need to compute the interest at 18% from 26th of the next month till the actual date of payment. And this point is common whether it is fixed sum method or it is self-assessment method. With respect to first month or second month of the quarter, if the tax is not paid by 25th of next month, we need to compute interest at 18% from 26th of next month till the date of payment. This is common between FSM and SAM. Now, thereafter, we need to ascertain what is our actual liability. So, we need to check what is our actual liability. The actual liability of July month is 40,000 and 45,000 and 50,000. Now, this 40 plus 45 plus 50, so differential amount if any, for July to September, by when we need to pay? Suppose if you are in Tamil Nadu, what is the due date of GSTR 3B? GSTR 3B due date is 22nd of October, correct? So now, what is the difference amount that you need to pay? 40 plus 45 plus 50 minus 35 and 35 already which we paid. Sir, 35,000 already you paid. So now the differential amount only you need to pay. So what is the differential amount you need to pay by? So that is 50 plus here 10,000, 60 plus here 5,000 difference. So what is the difference amount? So the difference amount, if you see, 5,000 and here 10,000 and here entire 50,000, that should be paid. So 65,000 you need to pay by 22 October. Suppose if 3B file late, then on the 65,000 we need to pay interest. At what rate? 18% till the actual date of filing 3B. See the third point. So if 3B for the quarter is filed late, interest at 18% per annum from 23rd or 25th of the month following the quarter till the date of filing 3B on the net liability mentioned in 3B. So therefore, this is the net liability 65,000. So this 65,000 is the net liability, and that we need to pay interest because of filing 3B late. Now, there is a 5,000 rupees difference for the first month. This 5,000 rupees pertains to which month? July month. We should have paid it by when? 25th August. But this 5,000, when are we paying? 22nd October. Whether we need to pay any interest? No, because this is which method? Fixed sum method. Again, August month, difference amount 10,000 rupees. This 10,000 we should have paid by when? 25th of September. But when are we actually paying it? 22nd October. Are we required to pay any interest on the difference amount? No, because we are following fixed sum method. That's why in case of differential tax, that is actual tax minus tax already paid with respect to first month and second month of the quarter, we don't have to pay any interest under fixed sum method. But this is the place where in self-assessment method there is a difference. What is it they are telling? Suppose if the same situation is related to self-assessment method, then you tell me what will happen. So 35,000, first interest same, last interest also same. What is the first interest? 35,000 and 35,000. If you are not paying by 25th of next month, then you need to pay interest, correct? Then last interest, what is it? Last interest 65,000. If you are not paying by 22nd of October, then also you need to pay interest. But the middle interest is only different. What is that? Difference amount. On the difference amount also we need to pay interest. Which difference amount? 5,000 and 10,000. 5,000 pertains to which month? July month. By when we should have paid? 25th of August. But when are we paying? 22nd of October. Even though we paid it by due date of 3B, we need to pay the interest at what rate? 18%. From which date to which date? From 26th of August till the date of 22nd October we are filing 3B. You got it? So on the difference amount, we need to pay interest. Interest at 18% per annum from 26th of next month till the date of payment. Under which method this interest is applicable? Self-assessment method. Be careful in the question. They can definitely test it related to the interest computation. So this is about QRMP, quarterly return monthly payment. Then look into the next one, time limits for various returns. So first return is GSTR1. So GSTR1, what is the due date? Who will be filing GSTR1? Every registered person. What does it contain? Outward supply details. And what is the time limit? If it is monthly GSTR1, 11th of the next month. If it is quarterly GSTR1, 13th of the month following every quarter. Okay. Then IFF. What is the time limit for IFF? First 2 months of the quarter, we need to file this IFF by 13th of the next month. 13th of the month following every month. Then 1 series, okay. 2 series, GSTR2, we will not file. We will get it. So we don't have to bother about time limit. But 3 series, only one we have, 3B. 3B, when we are required to file 3B, so every registered person is required to file 3B that contains the details of output tax, input tax, net GST payable, interest, late fee, etc. And this GSTR 3B is a summary return that contains consolidated details of everything. But GSTR 1 contains invoice details. 3B, when we should file, time limit. So in case of monthly, 20th of the month following every month. In case of quarterly, 22nd or 24th of the month following every month. So what are the notified states for which 22nd will be applicable? Underline GMCA. GMCA and below. GMCA and below. That is Gujarat, Madhya Pradesh, Chhattisgarh, Andhra Pradesh and below states. So for them, notified states, it will be 22nd. For other states, it will be 24th. Then next series is GSTR4. GSTR4, who will file? A person opting for composition scheme, and it's an annual return. What is the time limit for filing this annual return by a person opting for composition scheme? 30th April of the succeeding financial year. Whereas CMP8 is also a return which is filed by a person opting for composition scheme, which is a quarterly return by 18th of the month following every quarter. Then next series is GSTR5. GSTR5, who will file? NRTP, non-resident taxable person, who is coming from outside India to India, who is not having any fixed place of business in India. And that GSTR5, what is the time limit? So basically NRTP will not get a permanent registration, temporary registration. So 13th of the month following every month or 7 days from expiry of registration, whichever is earlier. That is the time limit by which they need to file. Then 5A. 5A will be by a OIDR supplier located outside India. They need to get registration in India. They need to file. GSTR 5A is like GSTR 3B, 20th of the month following every month. That's a regular time limit. So this is by OIDR supplier. Then GSTR 6. GSTR 6 we discussed in ISD, Input Service Distributor. What is the time limit for that? 13th of the month following every month. Monthly they need to distribute the credit. By 13th they need to file this GSTR 6. GSTR 7 and 8. 7 is what? TDS. GSTR 8 is TCS. What is the time limit? 10th of the month following every month. Then GSTR 9 and 9B. So who will be filing 9 annual return? And annual return 9B is by e-commerce operator. And what is the time limit for this annual return 9? 31st December of the succeeding financial year. Remember, GSTR 9 is required to be filed by a person whose aggregate turnover during the financial year exceeds 2 crores. GSTR 9 mandatory. GSTR 9 mandatory if aggregate turnover during a financial year exceeds 2 crores. If aggregate turnover in a financial year exceeds 2 crores, GSTR 9 is mandatory. Otherwise, it is optional. Whereas 9C, you see, 9C was previously an audit statement and now it's a self-certified reconciliation statement. To whom 9C is applicable? If their aggregate turnover in a financial year exceeds 5 crores, so then 9C will be applicable. And time limit is same. For all 9 series, the time limit is 31st December of the succeeding financial year. Then the next one is GSTR 10. GSTR 10, is a final return. Who will be filing this final return? person whose registration is to be cancelled. So what is the time limit of this final return? 3 months from the date of cancellation or order of cancellation, whichever is later, not earlier, whichever is later. So this later points alone please highlight and remember here, because usually whichever is earlier is by default we will remember, we will know, but later is the place where we get confused. So somewhere while preparing, so you write somewhere in the book or some sticky note and paste it, which and all places we will take whichever is later. So that points you keep in mind so that you will not get confused sitting in the exam hall, okay? Because sitting in the exam hall, all kind of doubts we will be getting. Sometimes direct tax and all we will learn in indirect tax exam. Yes, trust me, promise. Many students told me that, sir, I did not remember anything of DT in DT exam, sir, but in IDT exam, everything I learnt in DT I am able to recollect, sir. Too much pressure. It will happen like that, okay? So IDT will not remember. That's why. So many times you need to revise, and this kind of small points and all you need to write and keep, okay? Sometimes it will be like maximum 2 lakhs, minimum 2 lakhs. So this confusion and all will come, okay? Then, so it is whichever is later. Moreover here, 3 months from the date of cancellation, but order of cancellation don't add 3 months. Order of cancellation, A is date of cancellation plus 3 months. B is order of cancellation, whichever is later. Sir, what is the difference between this? Date of cancellation is the effective date of cancellation. Order of cancellation is the date on which we got the order to our hand. But in that order, they will mention the effective date, because they would have suspended our registration backwards. So that date will be given as the effective date of cancellation. From that date, effective date plus 3 months or order of cancellation, whichever is later is the time limit for filing final return, and final return will be filed by a person whose registration is cancelled. GSTR 11 is to be filed by UIN holder. UIN holder will claim refund now. Refund of what? Their inward supplies. So all the inward supplies details they will be showing in GSTR 11 at the time of filing refund claim. How they will file the refund claim? On a quarterly basis. So quarterly basis, 2 years from the end of the quarter they will file now. At the time of filing refund claim, they will be filing GSTR 11. Then look into the next one, sequential filing of returns. So these are some special points, okay? And one query here, sir, annual return for composition scheme is GSTR 9A or GSTR 4? Initially 9A. Initially 9A for few years. Thereafter 9A they have scrapped. In the place of 9A they have brought in GSTR 4. So don't worry, if you write GSTR 9A also, that won't be a wrong answer. So GSTR 9A or 4, but the apt one is at present GSTR 4. But anyway, if you are coming across GSTR 9A, that was the annual return for that particular financial year, and therefore that is now scrapped. At present, what is that you need to remember? GSTR 4 by 30th April of the succeeding financial year. Then special points on return, sequential filing of returns. So first we need to file GSTR 1 of this month, then only you can file 3B. Without filing GSTR 1, you cannot file 3B of that month. Same way, without filing 3B of the previous month, you cannot file the GSTR 1 of the second month. And then same way 3B, GSTR 1. Like this, there is a sequential filing of returns. 2 points you need to remember. Without filing GSTR 1 of the current month, we cannot file 3B of the current month. Then without filing GSTR 3B of the previous month, we cannot file the GSTR 1 of the current month. Then second point, government on the recommendations of the council may allow to file GSTR 1 even if GSTR 1 is not filed for prior periods. Yes, they have given, from time to time they will be coming out with this called as amnesty scheme. So wherein if you have not filed any returns and all, don't worry, we will give you one shutter, we will open the shutter and you can file all those returns and all now, so that you can escape from cancellation of registration. From time to time this amnesty scheme is given, so that provision is this. Then third, in the following cases, this already we discussed section 38, what are the cases where even though supplier files GSTR1, but it will come under ITC 2B as ITC not available. Then 88C and 88D also, already we made a discussion related to this. Then look into the next one. Who are not required to file GSTR1 or GSTR3B? Remember, tonic T square, T for TDS, TCS deductor. Why? Because they will be filing GSTR7 and GSTR8, so 1 and 3B not applicable to them. OIDR supplier, because they will be filing GSTR5A, so that's why 1 or 3B not applicable. Then NRTP, they will be filing GSTR5. So due to that reason 1 or 3B not applicable. Input service distributor, because they will be filing GSTR6, that's why it will not be applicable. C, composition scheme, because they will be filing CMP 8. So that's why GSTR1 or 3B not applicable. So remember, tonic, in the tonic T square, they are not required to file. So GSTR1 or 3B. Who are not required to file annual return? Remember, CAG tonic. Okay, only one T, not two T's, only one T. CAG tonic. CAG, that is persons whose books of accounts are subject to audit by Comptroller and Auditor General. They are not required to file annual return. Then T. Sir, TCS deductor is required to file annual return GSTR 9B, but TDS deductor not required to file. So TDS deductor. O, same, OIDR supplier. N, non-resident taxable person. I, same, input service distributor. But see, composition scheme they will file annual return. So it is casual taxable person. From this discussion, you tell me what is the return that will be filed by a casual taxable person? Who is a casual taxable person? Who come from another state to this state, who is not having any physical place of business in this state. What is the return that he will be filing? GSTR 1 and 3B. So somewhere you write down, a casual taxable person is required to file GSTR 1 and GSTR 3B. Casual taxable person is required to file GSTR 1, and GSTR 3B. They are required to file this. Only NRTP not required. And casual taxable person, are they required to file annual return? No, they are not required to file annual return. Then we are moving on to late fee for delay in filing returns. Late fee purely for MCQ. Okay. Now for 1 mark, if at all a MCQ comes, it will be for 1 mark. But sir, should I remember this for 1 mark? No, why to leave that 1 mark also? Okay. So we'll make an effort. Maybe if the MCQ is easy, 1 mark we will get now. We will learn here. If it is not coming, okay. If it is coming, but it is so easy, then outside when you come out of the exam hall, your friend will be telling, hey, you know what, late fee came, this much only is the answer. And you will feel guilty. Yeah, I have not written this. So this guilt should not be there. That's the reason why you learn this. So late fee for delay in filing return. What is that? GSTR 1 and GSTR 3B. Mostly GSTR 1 and 3B only will be tested, or annual return will be tested. So these two you remember, try to remember. GSTR 1 and 3B. What is the late fee? If it is nil return, 10 rupees per day. If it is other than nil return, 25 rupees per day. All these late fees under one act, CGST Act. The same amount is payable under SGST Act, but we don't have any late fee under IGST Act. So 10 rupees per day and 25 rupees per day. Which case 10 rupees per day nil return. Other than nil return, 25 rupees per day. Subject to maximum. If it is nil return, maximum 250 rupees. Suppose if the delay is 30 days. 30 days into 10, 300. But the maximum is only 250. Whereas, in case of other than nil return, there is a maximum late fee. How much is that maximum? If your turnover during previous year exceeds 5 crores, 5,000. If your turnover during previous year exceeds 1.5 but does not exceed 5 crores, 2,500. If your turnover during previous year exceeds does not exceed 1.5 crores, 1,000. So slab you remember, 5,000, 2,500, 1,000. When 5,000, if your aggregate turnover during previous year exceeds 5 crores. If it exceeds 1.5 but does not exceed 5, 2,500. If it does not exceed 1.5 crores, 1,000. Then next GSTR 5, GSTR 5A and 6. For all these three, it is same. Nil return, 10 rupees per day. Other than nil return, 25 rupees per day. Maximum, same, 5,000. No change in that. So, nil return 10 rupees per day, other than nil return 25 rupees per day, subject to maximum 5,000. GSTR 7 and 8 already we learnt. For 7 it is what? 25 rupees per day, subject to maximum 1,000. For GSTR 8, 100 rupees per day, subject to maximum 5,000. Then GSTR 4. To whom GSTR 4 is applicable? Concentrate. To whom it is applicable? Person opting for composition scheme. Person opting for composition scheme, what should be the maximum turnover during previous year? 1 point. Does not exceed 1.5 crores. If does not exceed 1.5 crores, what is the maximum late fee for GSTR 1, GSTR 3B? 1,000. Correct. Copy paste. So if it is nil return, 10 rupees per day, subject to maximum 250. If it is other than nil return, 25 rupees per day, subject to maximum 1,000. Why sir maximum 1,000? Because their turnover during previous year does not exceed 1.5 crores. Then GSTR 9, 9B, 9C for annual return. So there is a late fee. What is a late fee? See, 3 slabs are there. First you see per day late fee. If your turnover exceeds 20 crores, if your turnover exceeds 20 crores, 100 rupees per day. If it exceeds 5 but does not exceed 20, half, 50 rupees per day. If your turnover does not exceed 5 crores, then it will be half of that, 25 rupees per day. Okay, so per day late fee you try to remember. More than 20 crores previous year, how much? 100. More than 5 but does not exceed 20, half, 50. Does not exceed 5 crores, 25. This is per day late fee. Maximum late fee. First case 0.25%. 0.25% of what? Turnover. Next 2 cases 0.02% of turnover. Okay. This is the late fee, and all these late fees is under CGST Act and respective late fee payable under SGST Act also. But the late fee under IGST Act is not applicable if the late fee under CGST, SGST is paid. Then there are some returns which can be filed through SMS. What are they? Nil return. It should be a nil return. What is a nil return? All the fields in the return should be nil. Then only it will be called as a nil return. And GSTR 1, GSTR 3B and CMP 8. These 3 returns we can file through SMS, but all the entries in the return should be nil. Then first return. Who will be filing this first return? So immediately after our registration, so the first return that we file, we should mention not only the details of the month for which we are filing the returns, even for the period before the date of registration. For example, you say take liable to register is 20th of March 2023, and we applied for registration and we got the registration certificate. That registration certificate we got on 14th of April 2023. Now what is the first return that we will be filing? We will be filing first return for April 2023, correct? First return we will file for April 2023. Because 14th April only we got registration na. First return for April 2023. This first return for April 2023 should not only contain the details of April 2023 but also March details. From the date you are liable to get registered till the date you got registration certificate, even those transactions also it should be included, because you need to pay GST on those transactions also. So every registered person who has made outward supplies in the period between the date he is liable to register, 20th March, till the date registration has been granted, 14th April, these details should be included in the first return, which is furnished by him after grant of registration. Then if you are required to file returns but you have not filed any returns, then what will happen? You will get a notice that is in GSTR 3A. So that notice in GSTR 3A, once you get, within 15 days of notice you need to file return. Sir, what will happen if you are not filing returns within this 15 days? That will lead to best judgment assessment, under section 62. Got it? So right there, if returns not filed, if returns not filed within 15 days after notice, within 15 days after notice, comma, best judgment assessment shall be initiated under section 62. So this is the consequence of not filing the return within 15 days of notice. First, you miss the due date, you will get a notice in GSTR 3A, and after 3A within 15 days you should file the return, otherwise they will pass a best judgment assessment order. Then see the next page, rectification of returns. So there is no concept of revision in returns in GST, there is only rectification of returns. What are the returns that can be rectified? GSTR 1, GSTR 3B and GSTR 8. But rectification should not be on account of scrutiny, audit, investigation or enforcement activities. And what is the time limit for rectification? 30th November of next financial year or date of filing annual return, whichever is earlier. In 5 places, the time limit is same. What are those 5 places? Time limit for availment of ITC, time limit for issuance of credit note, and time limit for rectification of GSTR 1, time limit for rectification of GSTR 3B, and time limit for rectification of GSTR 8. In these 5 cases, the time limit is common, 30th November of the succeeding financial year or date of filing annual return, whichever is earlier. And then, how the details should be reported in GSTR 1. Outward supply details in GSTR 1, whether we need to show invoice wise or we need to show consolidated details. Say this. First we need to check, is it B2B or B2C? B2B, always invoice wise details we need to upload, correct? Whereas if it is B2C, B2C, interstate, intrastate. You see intrastate, always consolidated. So remember the first point, B2B, always invoice wise. B2C, intrastate, always consolidated. B2C, interstate. B2C, interstate, if the invoice value exceed 2,50,000 per invoice, invoice wise. If the invoice value does not exceed 2,50,000 per invoice, then state-wise consolidation needs to be done. Got it? Then, next one, section 48. So, role of GST practitioner. So, there is a concept of GST practitioner which was not much tested in the last attempts, any attempts, and therefore we may not get. If at all we get, this question we will get. What are the activities that can be performed by a GST practitioner? These are the only activities which can be done by them. So they can make application for registration, they can file the returns, and they can file the intimation for opting into composition scheme or withdrawal from composition scheme. They can make an application for refund and they can make payment of tax, and they can act as an authorized representative, and they can furnish information for generation of e-way bill, that is data entry they can do, and they can enter the details of ITC4. What is ITC4? Goods sent on job work and received from job work, and they can make application for amendment or cancellation of unique enrollment number. So usually transporter, warehouse keeper and supplier of goods through e-commerce operator, these 3 people will be obtaining unique enrollment number right there. So transporter, warehouse keeper and supplier of goods through e-commerce operator, who and all will get unique enrollment number? Transporter, even though not registered. Okay. Number 2, warehouse keeper, even though not registered. Warehouse keeper also, even though not registered. Number 3, supplier of goods through e-commerce operator. Supplier of goods through e-commerce operator. These 3 people, even though not registered, they will be making, like application for unique enrollment number. That application can be done by GST practitioner. So what are the 8 activities which can be done by GST practitioner? Come on. They can make application for registration, they can file returns, and they can make payment of tax or apply for refund, and they can file intimation for entry into composition scheme or exit from composition scheme. And thereafter they can act as an authorized representative, they can do data entry for e-way bill, and they can furnish the details of goods sent on job work, received from job work, they can make application for enrollment, unique enrollment number or amendment to unique enrollment number. Then what are the eligibility conditions? They should be citizen of India, because foreigners and all should not come and become GST practitioners. Okay, so we create a exclusivity, Indian they should be, and person of sound mind and not adjudged as insolvent. Director disqualifications, all these are. So citizen of India, person of sound mind, not adjudged as insolvent, not convicted for an offense beyond 2 years. Means up to 2 years if he is imprisoned, okay, he can become GST practitioner. But he should not be convicted of an offense with imprisonment not less than 2 years. Not less than 2 years means what? Greater than 2 years. This is the eligibility condition, 4 conditions. Plus, he should also possess certain educational qualification here. Basically, they have given some list of educational qualifications, like they should be having degree, any degree, or they should be having this CA, CMA final or CS final they should have completed, like that. But previously any degree was there, but now an amendment they have made, so related degree they should have. Related degree means, so it should be like commerce, higher auditing, business administration, etc. So related to commerce. So then only they can become a GST practitioner. Previously, can an engineering graduate become GST practitioner? Yes. But now an engineering graduate cannot become a GST practitioner. So that's the amendment that they have made. Then, responsibility for correctness of particulars. So GST practitioner is filing returns. In this returns, there is a mistake. Now, who is held responsible? The registered person, not the GST practitioner. The responsibility for filing of returns or any incorrect particulars in the returns lies with the registered person. So GST practitioner should exercise due diligence while filing the returns, and he should make it available to the registered person. He should get an approval from the registered person through SMS or mail, and the registered person should check whether the details mentioned in the return is correct, and only after his approval the GST practitioner should file the return. And if there is no approval given by the registered person, deemed approval, that GST practitioner can file. The registered person, before confirming, should ensure the facts mentioned in the return are true and correct. However, failure to respond to the request for confirmation shall be treated as deemed confirmation. And GST practitioner shall prepare all statements with due diligence and affix their digital signature. If they are found guilty of misconduct, their enrollment will be cancelled, but there is no prosecution on them, imprisonment and all not applicable, just their enrollment will be cancelled. So because these are the activities they can do, for this and all we cannot send them for imprisonment, so due to that reason, so there is no imprisonment on them. So this is about returns that we have completed. Okay. Segment 14 and segment 13 related to returns payment process already we have discussed in part 3. So now we are moving on to segment 15, that is accounts and records e-waybill. So as per section 35, so here 35, 36 talks about accounts and records. 35 says that what are the various accounts and records required to be maintained by a registered person, and 36 talks about what is the period for which that accounts and records should be maintained. So what are the various accounts and records to be maintained by a registered person? Remember this keyword I formats. I for inward supplies. Inward supplies all purchase details along with the details of the suppliers, name and address and the details of the supplier along with the relevant documents like tax invoice, debit notes and credit notes. So that is inward supplies. Number 2, foreign trade, that is import and export of goods. So import of goods along with the details of bill of entries, export of goods along with details of shipping bills. And outward supplies, so outward supplies, so along with the details of the name and address and other details of the recipient with the details of invoices, debit notes and credit notes. RCM purchase, out of the inward supplies, what are the purchase on which GST payable under RCM? IFOR, M for manufacture and production related records, but this is applicable only in case of a manufacturer, not by a trader or service provider. Then advances received, paid or adjusted. So advances received from the customers and advance paid to the suppliers, and adjustment of advances for the purpose of payment of liability. And tax details, input tax and output tax, and stock of goods along with the details of the place where that stock is stored. So these are the various accounts and records to be maintained by a registered person as per section 35. Where these accounts and records where these accounts and records will be maintained. So these accounts and records will be maintained in the principal place of business pertaining to all place of business, whereas in every additional place of business we need to maintain the accounts and records pertaining to that additional place of business. Whereas in case of this tax details and stock of goods, it is not required for a person opting for composition scheme. So this tax details as well as stock of goods not required for a person opting for composition scheme. So they need to maintain I forma. So as per section 35, the above records will be maintained by every registered person in principal place of business and records pertaining to additional place of business in each and every additional place of business. Whereas what is this period for which these accounts and records to be maintained? As per section 36, normal cases 72 months, that is 6 years, but in law you write, exam you write 72 months. So 72 months from the due date of furnishing annual return for a particular financial year. For example, if the financial year is 22-23, so 22-23 due date of furnishing annual return is 31st December 2023. 31st December 2023, 6 years, 24, 25, 26, 27, 28, 29. So till that time they need to maintain the accounts and records pertaining to this previous year or financial year 22-23. Suppose in that particular financial year we went for an appeal, then in that case 1 year from the outcome of the appeal or 6 years from the due date of furnishing annual return, whichever is later, not whichever is earlier, whichever is later. So 72 months from the due date of filing annual return or 1 year from the disposal of appeal proceedings, whichever is later. And every transporter or warehouse keeper, even though not registered, should obtain a unique enrollment number. Generally GST law is applicable only to a registered person. So all these accounts and records are also applicable to a registered person, but if there is a warehouse keeper or a transporter, even though their aggregate turnover not exceeding threshold limit, they need to get a unique enrollment number and they need to maintain necessary records related to their business. So this is about accounts and records 35, 36, and then 37, 38, 39, 40, 41, 42 and 43 we don't have, then 44, 45, 46, 47. So we have seen in returns. So then we have seen section 49, 50, 51 and 52, that is TDS TCS. So that is in payment process, and then 53 onwards, so till 59, so that we have 58 we have seen in refunds chapter. So this e-way bill is also a connecting area. This e-way bill is not given in any section, but it is given through the rule. E-way bill is a document which is to be given by the supplier or recipient or any other person who is causing movement of the goods. So this e-way bill contains the details of the goods which are to be transported along with the details of the vehicle. So basically whenever there is a movement of goods, e-way bill is required. Whereas e-way bill is not applicable in case of exempted goods, and it is not applicable even if the value of goods does not exceed 50,000 rupees. But while determining the value of the goods, you need to take GST, including GST, but excluding the exempted supplies. Suppose if a document contains both taxable supplies and exempted supplies, take out the exempted supplies and see the taxable supplies and add GST. If that exceeds 50,000 rupees, then only e-way bill is applicable. If it is less than or equals to 50,000, e-way bill not applicable. However, in case of goods sent on job work and in case of handicraft goods, even if the value does not exceed 50,000 rupees, definitely e-way bill is required. And e-way bill has two parts. Part A contains the invoice details and part B contains the vehicle details. So part A contains GSTN details of supplier, recipient, document number and reason for transportation, whereas part B comprises of transport details. And what is the validity of the e-way bill? So e-way bill once generated will be having a validity of 1 day for every 200 kilometers or part thereof. In case of over-dimensional cargo or multi-mode transportation where one leg of the journey is by vessel, then it will be 1 day for every 20 kilometers or part thereof. For example, if the distance is 480 kilometers, so 480 kilometers means the validity will be taken as 3 days. So first 200 kilometers 1 day, next 200 kilometers 1 day, and remaining 80 kilometers it will be 1 day. So like that the validity will be counted, and the validity will be starting from midnight of the day in which e-way bill is generated. So it will be counted from the midnight in which e-way bill is generated. For example, so today morning the e-way bill is generated, today midnight to tomorrow midnight is 1 day, and thereafter next day midnight is another day. So like that validity is counted. So validity will expire by midnight, and within 8 hours from the expiry of its validity, the e-way bill can be extended if the transportation or the movement is not completed within that time. Suppose if the validity is over and still the goods are being moved, so then it is as good as the goods are transported without e-way bill and the consequences will be arising. So see, we have some FAQs on e-way bill. So when e-way bill is not required, if at all we transport the goods through non-motorized vehicle, bullock cart, horse cart, etc., e-way bill not required. If the goods are transported between the customs places, that is between the airport, port, or land customs station, or container freight station, inland container depot, or customs warehouse. So between those places, because the goods are under the supervision of customs officer, so that do not require e-way bill. That is second point and third point. And fourth point, transit cargo to Nepal and Bhutan. Nepal and Bhutan landlocked countries. Goods are originally unloaded in India, and thereafter from India to Nepal and Bhutan it will be going, so that do not require e-way bill. And movement of goods for Ministry of Defence, so that do not, Ministry of Defence goods in whichever mode it is transported, e-way bill not required. And empty cargo containers are being transported because there is no goods inside that container, but the container itself can be taken as goods, but that do not require e-way bill. Then consignor transporting goods to or from between the place of business and a weight bridge. So first the lorry will go to the weight bridge to take the weight of the lorry. So that lorry do not contain goods, so that for e-way bill not required. Now again the lorry will return to the factory and the goods will be taken into the lorry. Now the lorry will go to the weight bridge for the purpose of taking the weight of the lorry with goods. Now as the goods are there inside the lorry, if the movement is within 20 kilometers, e-way bill not required. If the movement is beyond 20 kilometers, e-way bill is required. Then goods being transported by rail, where the consignor of the goods is the central government, state government, or local authority. So this is point number 8. This also do not require e-way bill. The difference between 5th point and 8th point is that in the 5th point it belongs to Ministry of Defence, whereas in the 8th point it belongs to government, but only rail, whereas here it can be by any mode. The next one, goods specified as exempted from the e-way bill requirement in the respective states. So that also will be taken. And there are some goods which are given in these rules. So that is transportation of certain specified goods, LPG for supply to household and non-domestic exempted category customers. So that is basically that red color cylinders transportation do not require e-way bill. This is other than dealer of cylinder. Suppose if the dealer of cylinder is transporting, let it be red color or the blue color, that will definitely require e-way bill. But a consumer is taking the cylinder from the location of the dealer to his house, so then that do not require e-way bill. Kerosene oil sold under public distribution system, then postal baggage, and then natural or cultured pearls or any jewelry or silver or articles, precious articles, so that do not require. But imitation jewelry, that is not jewelry, that requires e-way bill. And used personal and household effects. So whether e-way bill is required for movement of goods is not for supply. So even though the movement is under supply or without supply, e-way bill is required. If it is under supply, tax invoice plus e-way bill. If it is without supply, delivery challan plus e-way bill. Whether the 50,000 limit is for taxable goods or exempted goods. So it is for taxable goods. If there is exempted as well as taxable, take out exempted goods and check the value. While computing invoice value, whether GST to be included or not, yes, GST needs to be included. Who will generate the e-way bill? Generally, e-way bill will be generated by the registered person who is causing the movement of the goods. If the supplier is registered and he is causing movement of the goods, supplier will be generating part A of the e-way bill. So he will enter the part A details. Suppose if the supplier is unregistered and the recipient is registered and the recipient is causing movement of the goods, the recipient will enter the part A details. If both supplier and recipient are unregistered, the transporter will enter the part A details. Alternatively, either supplier or recipient can enroll as citizen of India and they can enter the part A details. And so whether transporter is required to generate e-way bill even if the value of each consignment does not exceed 50,000 rupees. Yes. So generally there are 10 consignors who are sending the consignments through the transporter and each consignment value does not exceed 50,000. So suppliers will not be generating e-way bill. But all these e-way bills cumulatively, if you see, it exceeds 50,000 rupees because these 10 consignments transported in a single lorry, the lorry value exceeds more than 50,000 with respect to all the consignments. Now this transporter, for each consignment separately he need to prepare a e-way bill plus all these consignments, a consolidated e-way bill will be generated. So transporter should generate e-way bill, so EWB1 with respect to each consignment and EWB2 consolidated e-way bill individually for each consignment even though the value is less than or equal to 50,000. In aggregate it exceeds 50,000 due to that reason. Then blocking of e-way bill. If we are not filing GSTR1, GSTR3B or CMP8 for consecutive 2 quarters, then e-way bill will be blocked. So, but e-way bill will be blocked only with respect to outward movement of goods. So that is for if a person has not filed returns for their inward movement. If a person has not filed returns With respect to their inward movement, there is no issue. So e-way bill can be generated. With respect to their outward movement only, e-way bill is not possible, and that e-way bill cannot be generated by transporter, supplier, recipient or any other person. So e-way bill generation facility is blocked only with respect to outward movement of goods by registered person who has not filed returns as above. However, e-way bill can be generated in respect of inward supplies and other points in case of bill to ship to transactions. So I am delivering the goods to a third person and I am raising invoice to the recipient. In that case, one e-way bill is sufficient, even though there involves two supplies, and multi-vehicle updation is possible in e-way bill up to some distance in one vehicle, thereafter another vehicle, multi-vehicle updation is possible. Then once the part A details are entered, the part B, that is vehicle details, needs to be entered within 15 days. So part B should be updated within 15 days from updation of part A. E-way bill should be accepted by the recipient within 72 hours of generation or delivery, whichever is earlier, and part B who can update either by the supplier or recipient or by the transporter, whomsoever knows the vehicle number, they will be updating the part B details. And movement of goods, if it is taxable goods under supply, then tax invoice plus e-way bill. If it is without supply, delivery challan plus e-way bill. When it is exempted goods, so tax bill under supply, bill of supply, and without supply, delivery challan, e-way bill is not required in that case. So these are the provisions with respect to accounts and records and e-way bill. So refunds under GST already we have discussed, and the next area that we have is assessment and audit. In this assessment and audit, the first few areas is related to interest computation, which we have come across in many places. First, section 50 subsection 1 interest talks about interest on account of delay in payment of tax or short payment of tax. So that rate of interest is 18% per annum and it will be computed from the first date after due date. So the due date depends upon the due date of GST or 3B, and first day after due date till the date of payment of GST. Whereas section 50 subsection 3 interest is on account of wrong availment and utilization of ITC, the interest rate is 18% per annum. It is first day after utilization till the date of payment of GST. What will be considered as the date of payment of GST? Date of filing 3B or date of making payment through DRC3, that will be taken. Whereas section 60 interest is talking about provisional assessment. So usually when a person is unable to determine what is the value or the rate of GST, that person can make an application for provisional assessment, wherein the officer will ask the person to provisionally pay some amount, and thereafter upon finalization some differential amount will be either payable or it will be refundable to that person. Suppose if the differential amount is payable, then what will be the rate of interest? 18% per annum. And in this case, the interest will be computed as usual from the first date after due date pertaining to the month in which the provisional assessment is resorted. So first day after the due date of the month for which tax is provisional assessed till the date of payment of the differential amount. Whereas section 16 is in case of non-payment of consideration to the supplier within 180 days from the date of invoice. So much of the ITC avail needs to be reversed along with interest 18% from the date of first date after utilization of ITC till the date of addition of that ITC to the liability. If you don't have, and that is reversal. So if you don't have the balance in ITC, then you will make the payment. So then 17 read with rule 42, that is we need to compute the provisional D1 and D2 which we are doing monthly basis plus final D1 and D2 needs to be computed. If the final D1 D2 is more than the provisional D1 and D2, so which is already reversed, that differential amount we need to reverse in ITC, and again interest will be at the rate of 18% per annum from the first April of the succeeding financial year. Means we need to do this comparison at the end of the financial year. So first April of the succeeding financial year till the payment of such difference. Whereas next one is section 17 read with section 43. This is reversal of ITC pertaining to capital goods. So in case of capital goods, what will happen is that we will be availing the ITC initially and thereafter we will reverse over a period of 60 months. So now in this case the interest rate will be 18% from the first date after availment of ITC till the date of addition of the proportionate ITC. Whereas section 56 interest on account of delay in refund, usually refund should be granted within 60 days from the date we make application for refund. If the refund is not granted within 60 days, from 61st day the interest will be computed at the rate of 6% per annum till the date of refund. Whereas section 56, there is another refund which is arising on account of any adjustment order or appellate order, etc., then that is court will be granting the refund. The interest rate will be 9% per annum. Again, same time limit, 61st date from the date of application till the actual date of refund. So here due date refers to due date of 3B. Usually 20th of the month following every month will be taken. Suppose if there is any delay in filing 3B, then the interest will be payable on net liability, provided the liability is reported in 3B. Suppose if the liability is not reported in 3B, it is pertaining to 1 month which is paid in the other month. So then in that case the interest will be computed on the gross liability. Then assessment under GST, basically we have, so section 59 onwards covered under this. So 59, 60, 59 talks about self-assessment, 60 provisional assessment. So up to 59, that is 58 is refunds chapter. So 59 self-assessment, 60 provisional assessment, 61 scrutiny assessment, then 62 and 63 best judgment assessment, and 64 summary assessment. So here what happens is that, so whenever a person is able to compute his GST payable, then it will be called as self-assessment. Whenever the person is unable to compute how much is the GST that he need to pay, he will request the officer to compute, that is called as provisional assessment. Whereas scrutiny assessment is whenever the self-assessment is completed and the return is filed, the officer will be taking up the return for scrutiny, and if everything is fine and everything is perfect, so then the assessment is completed. Otherwise, so the officer will initiate any one of the actions like either audit or recovery, etc. Whereas then section 62 and 63 talks about best judgment assessment. In that, two best judgment assessments are there. Number one, with respect to non-filers of return, a person is required to file returns but he did not file the return. In that case, so best judgment assessment will be initiated under section 62. Whereas in case an unregistered person who crossed the threshold limit but he not got registered, or he is making interstate supplies or covered under 24 but not got registered, so there is an unregistered person who is having some liability but he did not pay the liability, to initiate recovery, so they will be passing an assessment order under section 63. So then 64 talks about summary assessment. So in case when a person is evading the GST and the proper officer identified that and delay in passing the order, the person may escape from payment of GST, then they will invoke summary assessment order under section 64. Basically, assessment order is for the purpose of computing the GST payable, that is about assessment. Thereafter, the recovery order will be given under section 73 and 74. This assessment order is also in a way for the purpose of recovery only, and recovery order also separately 73 and 74 that we have. So now in this case, let's see about section 59 self-assessment. So status of the person is a registered person, and by registered person note is not applicable, and situation, every registered person has to assess the tax payable and they will furnish the return. What is the time limit for return? The due date of return will be taken. Officer to take any prior permission not applicable, withdrawal of order not applicable, and there are no consequences. Whereas if you see provisional assessment section 60, so it is not on the registered person, it is on the taxable person. Taxable person means a person who is liable to get registered, or who is already registered will be coming under a taxable person. So who will do this provisional assessment? This is done by the proper officer, and any notice will be given? No, because this person is only making application, so there is no question of notice. Situation when provisional assessment will come into picture, when the taxable person is unable to determine what is the value of goods or services or the GST that is payable. In that case, provisional assessment will come. So what is the time limit? So for the provisional assessment order should be passed within a period of 90 days from the date of receipt of such request. So once we make application for provisional assessment, within 90 days the provisional assessment order should be passed, and thereafter once the provisional assessment order is passed, so within 4 years, so 6 months plus 4 years, the final assessment order should be passed. So two time limits you need to remember. First we make application, so within 90 days they will pass a provisional assessment order. So after passing provisional assessment order, the final assessment order should be passed within 6 months. It can be extended for a further period of 6 months and further 4 years. So by the commissioner from the provisional assessment order. Officer to take any permission? No. Withdrawal of order? No. Consequences, what will happen? So calculate the final assessment amount and the provisional assessment amount, and suppose if it is positive, means what? Final assessment amount is greater than the provisional assessment amount, the differential amount is payable along with interest at the rate of 18% per annum from the first date after due date of the month for which we resorted for the provisional assessment till the actual date of payment. Suppose if it is negative, what is negative means? The final assessment amount is less than the provisional assessment amount. So when it is negative, so what will happen? So then we will get the interest refund. First we will get the refund. Suppose if the refund is not paid within 60 days, then from 60 days from the date of application, then from 61st day the interest will be payable to us. Then in case of scrutiny assessment will come whenever there is a self-assessment. So a self-assessed return will be taken up for scrutiny as per section 61 by the proper officer, and the proper officer will give a notice if there is any discrepancy. So mainly scrutiny assessment is in order to verify the correctness of the return. Proper officer may examine the return and seek explanations. So time limit, they have not given any time limit, but literally we need to connect the time limit to 73 and 74 because there is a time limit to give the notice for the purpose of recovery. So the recovery order under 73 needs to be passed within 3 years from the due date of furnishing annual return, whereas 74 needs to be passed within 5 years from the due date of furnishing annual return. So this 3 years and 5 years is the time limit for doing the recovery. So due to that reason, here when they take up the return for scrutiny, they should complete it within that time, otherwise the recovery cannot be made. So logically the order under section 73, 74 before that, so they need to complete this scrutiny assessment. Officer to take any permission, no. Withdrawal of order, no. Consequences, if the explanation is not obtained within 30 days or extended period. So what happens is that first they will be giving a notice and thereafter they need to seek the explanation. The explanation, that is reply, should be given within 30 days. Suppose if the reply is not given within 30 days or the registered person fails to take corrective measures, so the proper officer may conduct audit or initiate any recovery. So audit can be either special audit or departmental audit. Departmental audit under section 65 or special audit under section 66, or they can initiate search, so under section 67. And they can also, if they have sufficient evidences, then they can initiate recovery under 73 and 74. Okay. So then in case of best judgment assessment, section 62, when is it applicable? So there is a registered person and that person has not filed the returns. Registered person failed to furnish the return within 13 days from the GSTR 3A notice. A notice will be given under GSTR 3A. So if the returns are not filed, and after that notice under 3A, the return should be filed within 15 days. Otherwise, they will initiate best judgment assessment, and the best judgment assessment is done by the proper officer. And the time limit for best judgment assessment is 5 years from the due date of furnishing annual return for the relevant financial year, within a period of 5 years from the date of 31st December of the financial year for furnishing the annual return to which the tax paid pertains. So simply remember 5 years from the due date of filing annual return for the relevant financial year. And there is no permission to be taken by the officer. Withdrawal of order, yes. There is a facility of withdrawal of order when. So as we have not filed the return within 15 days, so the officer initiated best judgment assessment and they pass a best judgment assessment order. Once a best judgment assessment order is passed within 60 days, previously it was 30 days, within 60 days, now that's an amendment, within 60 days from the assessment order, best judgment assessment order, if you can file the returns. So what will happen? So whatever is the best judgment assessment order, that will be withdrawn, and as per your return only you will be liable to pay. So within this 60 days, but it can be extended for a further period of 60 days. So with the late fee of 100 rupees per day, such order shall be deemed to have been withdrawn. However, interest is payable. Here 100 rupees per day, here it is for the purpose of this section, section 62, but the regular late fee is also payable. What is that regular late fee? So whether within 60 days or beyond 60 days, as there is a delay in filing return, so we need to pay the regular late fee. Okay, that is this point, so please keep in mind. So regular late fee for delay in filing returns, regular late fee for delay in filing returns under section 47. So there is one section 47 which talks about the late fee. You can refer that section 47 in the book. That's it, book, it is there. So we have discussed in the returns chapter. So regular late fee for delay in filing returns under section 47 is payable whether such return is filed within 60 days or beyond 60 days. Within 60 days or beyond 60 days, when you are filing within 60 days or beyond 60 days, you need to pay the regular late fee under section 47. But this is late fee under section 62. What is that late fee under 62? Suppose if you are not filing returns after best judgment assessment order within 60 days, then for every day delay you need to pay 100 rupees. Now this is apart from that regular late fee. Okay. So then interest is also payable naturally, because there is a delay in filing returns means there is a delay in payment of tax. So interest is payable. So if you feel like Best judgment assessment order you don't have to pay. So then there is an option available to that person in case of section 62, that is best judgment assessment on account of non-filers of return. Whereas there is another best judgment assessment under section 63. This is on the unregistered person, where a taxable person failed to obtain registration or his registration got cancelled but still there is some pending liability. So in that case, proper officer will do the assessment and an opportunity of being heard, a notice will be given before passing the best judgment assessment order. The time limit for this best judgment assessment order is also same. So within 5 years from the due date of furnishing annuitant for the relevant financial year, and officer to take any permission, no, and withdrawal of order also, we don't have any withdrawal of order. So whatever withdrawal of order that we have seen in case of previous section 62 is not applicable in this case. So consequences, either pay as per the assessment order, or if you are not satisfied, go for the appeal. If not satisfied with respect to appeal order, then you can prefer an appeal. Whereas in case of summary assessment section 64, so this is also like income escaping assessment. So what will happen, proper officer will come into the premises and they will be checking that or they will check the goods in the transit, and they came to know that the goods are liable for confiscation and the person has contravened and there is a evasion, he need to pay, and he has reasonable evidence to believe that delay in passing assessment order, the person may escape from payment of GST. So as per section 64, on the taxable person, the proper officer, there is no opportunity of being heard. Everywhere there is opportunity of being heard, notice will be given, but this is only case where without notice they will pass directly the assessment order. What is the situation? The proper officer has evidence that the taxable person has incurred a liability, and the proper officer has sufficient grounds to believe that, so delay in passing an assessment order may adversely affect the revenue. These 2 points you need to write. So usually section 64 as a theory question they will be asking, the proper officer has evidence that the taxable person has incurred a liability, and proper officer has sufficient grounds to believe that, so delay in passing an assessment order may adversely affect the interest of the revenue. So then they will pass a summary assessment order, and there is no time limit for summary assessment order, but the person who is passing the summary assessment order, the officer, to take the permission of the additional or joint commissioner, because without notice they are passing an order. Due to that reason, withdrawal of order, yes, so either pay, that is in case when the order is erroneous, so they can withdraw the order, or upon request of the person to proceed under the regular assessment also, the order can be withdrawn. So pay as per the assessment order, or if the order is erroneous, proper officer may withdraw such order and follow the procedure under 73-74, the regular demand and recovery procedure. Then this is about assessment under GST, then audit under GST. So here it is up to section 64 summary assessment, then 65 and 66 is audit under GST. So in this section 65 and 66, section 65 talks about department audit and section 66 talks about special audit, and previously we had statutory audit under section 35 subsection 5, that is now omitted, so which is not applicable. So GSTR 9 and 9C. 9C was previously an audit report, and now 9C is just a self-certified reconciliation statement which is required to be filed by every registered person whose aggregate turnover in a financial year exceeds 5 crores. And this department audit section 65 is conducted by the commissioner or any other officer authorized by him. So but section 66 special audit will be conducted by CMA professional who is nominated by the commissioner. So when this audit is conducted, department audit usually based on some frequency they will be conducting, whereas that is whenever they have reasons to believe that there is some evasion, so immediately they will do the department audit. Whereas special audit will be conducted, so whenever there are some discrepancies in the valuation or the ITC, value of supply or the ITC. Then time period of audit, department audit should be completed within 3 months, and it can be extended for a further period of 6 months, whereas special audit should be completed within a period of 90 days, plus it can be extended for a further period of 90 days, and audit report shall be submitted to. In case of department audit, the report will be submitted to the registered person as well as to the superior, that is commissioner, within 30 days from conclusion of audit, whereas in case of special audit, so that audit report will be given only to the jurisdictional ACDC. And expenses of audit, who will bear the expenses for audit? So in case of special audit, the report will not be given to the registered person, keep that in mind, and expenses will be always borne by the department, and scope of audit in department audit, everything can be verified, whereas in special audit the scope is restricted only for valuation and ITC. And notice is not there in case of special audit, just a direction to get audited is issued, but in case of department audit, a 15 days prior notice, working days prior notice will be given before commencement of the audit. What if already audit is completed under any other law or under another section? Then this section will be applicable. So it's not that if audit is completed under any other law, this audit is not applicable. So this audit will also be applicable. And can the audit be done for a part of the year? Yes, it can be done for a part of the year. For example, we made registration only in the month of July. July to March is not even a year. So, but for July to March, can the audit be conducted? Yes, for part of the year also audit can be conducted. Now we are moving on to the next one, that is segment 18. Segment 18 is a very important area in this segment 18. So we will learn about search, seizure, offences and penalties. So first the search and seizure we will see. So search and seizure, basically in two situations the search and seizure will happen. Situation number one, proper officer will come into the premises of the registered person and they will be checking the goods, and if there is any goods that are liable for confiscation or any documents containing the details of the goods liable for confiscation or any things so that is liable for confiscation, all those things will be seized and thereafter a confiscation order will be passed. So this is section 67. Section 67 talks about the seizure and section 130 talks about the confiscation. So these two are connected. Section 67 read with section 130. So seizure and confiscation of goods from the place of business, section 67 read with section 130. Whereas another situation is seizure of goods during the transit. So when the goods are taken like from one place to another place during the transit, so the seizure search can be conducted by the proper officer, and that power to conduct search is given in section 68. And what if the goods are transported without valid documents? Then the penalty and other provisions are given under section 129. So total 4 sections are connected in search and seizure, that is section 67 read with 130 and section 68 read with 129. So first we will see situation 1. So inspection was carried out. Here search or inspection is interchangeably used in GST law. So inspection was carried out at the business premises of the taxable person or taxable person. Taxable person means either registered person or the person liable to get registered, transporter or warehouse operator. Sir, can any other premises also be searched? Yes, any other premises also can be searched. So any other premises, any premises. Suppose if the department is having doubt that, so in any premises the goods are stored or the goods are kept or the documents are kept, so they can do the search with respect to any premises. If any unaccounted goods are found, that goods are liable for confiscation. Now as per section 67, so the proper officer will seize the goods. So seizure from the place of business, what they will seize, either goods, documents, everything will be seized. And after that they have two options. Option number 1, pay the appropriate tax and penalty. So seizure has happened. So now the person, that is from whose premises the goods and the records were seized, so he has to pay some tax. So either pay the tax plus applicable penalty. So the tax with respect to those goods, penalty under section 122 subsection 1. Whenever a person is dealing in goods liable for confiscation, so he need to pay penalty under 122 subsection 1, and that penalty will be 100% of the tax evaded or 10,000, whichever is higher. So that penalty is required to be payable. So pay appropriate amount and get it released, that is pay applicable tax and penalty under 122 subsection 1. Goods shall be released and all proceedings in this respect shall be deemed to be concluded. Again, as and when those goods are sold, are we required to pay any GST? No. First of all, these goods are not brought into the records. So therefore, whenever you are selling those goods, really in future we don't have to pay any GST because already the tax has been discharged on those goods. Whereas option 2, furnish security and get the provisional release. Suppose if you don't have money to pay the tax, so but you need the goods, what you can do is that you can furnish the bond and the security, sufficient security, so that the goods will be released provisionally, and whenever we sell those goods, so we realize the money, at that time we will pay the tax and penalty. The proceedings are not concluded because this is only the provisional release of goods. Provisional release of goods by executing a bond covering the value. Now, suppose if the person has not exercised both the options, so he did not pay the tax and penalty or executed the bond, then a confiscation order will be passed. But they have not given what is the time limit within which the confiscation order will be passed. So a confiscation order will be passed by the department. So whenever the confiscation order is passed, what will happen? So far the possession only is with the department. Now the confiscation order is passed, means the ownership also will go to the department. Now once a confiscation order is passed, still the person on whom the confiscation order is passed is having an option to pay the fine along with tax and penalty. A fine can also be payable. So that fine is known as redemption fine. Upon payment of that fine, the goods will be released. What is the time limit within which he need to pay that fine? 3 months. So confiscation order plus redemption option. So option to redeem goods by paying fine within 3 months. So what and all he need to pay? Tax and penalty payable along with redemption fine. Suppose if he is not paying the fine also within 3 months, what will happen? So then the confiscation order is invoked, so that the goods will be, ownership also will be transferred to the department. The department will sell those goods, realize the money, and that money they will keep in their pocket. So which means it will not be given to the owner of that goods. If the option is not opted, confiscated goods shall be disposed of and entire amount retained by department. Okay, entire amount retained by department. So it will not be given to the person. And suppose if the redemption option is excised, how much is the redemption fine? There is no concrete or absolute amount of redemption fine. So it depends. Redemption fine in case of goods. So what is the maximum redemption fine? Market value of the goods minus tax chargeable thereon. So whatever is the market value of the goods minus tax chargeable, so that much can be the maximum redemption fine for goods. Now in this process, even the conveyance which contains the goods which are loaded in the business premises, there is a lorry in the business premises where the goods are loaded. So on that conveyance also the redemption fine is payable. So what is redemption fine for release of the conveyance? Tax payable on the goods transported thereon. So redemption fine, maximum redemption fine for release of the goods is market value of the goods minus tax payable thereon, whereas for release of conveyance, tax payable thereon will be taken. Then situation 2. Situation 2 is seizure of goods during the transit. So when the goods were during the transit, the goods were seized, and because the goods are not carrying proper e-waybill or proper documentation. So as per Section 68, conveyance carrying the goods are intercepted by the proper officer for inspection in transit. If the transporter was found transporting or storing such goods which are removed in contravention of the provisions of the Act, such goods and conveyance are liable for confiscation. Both goods and conveyance are liable for confiscation. So basically this is seizure during the transit. And here what happens, section 129, immediately after the seizure, they will be giving a notice for levying the penalty. So first a notice will be given within 7 days of verification of conveyance. Notice for what? Levying the penalty. After notice, within 7 days, so a penalty order will be passed. First seizure order, within 7 days notice. And after 7 days from the notice, a penalty order will be passed. Penalty order under 129 to pay the penalty within 7 days of service of notice after giving opportunity of being heard. So once a penalty order is passed, within 15 days of receipt of penalty order, we need to pay the penalty for release of goods. Otherwise, the goods will be disposed of by the department. Okay. So upon payment of penalty within 15 days of receipt of order, all the proceedings in this respect shall be deemed to be concluded. And the said period of 15 days shall be reduced in case of perishable goods. Now, so in the previous case, we need to pay tax and penalty, but here only the penalty is payable. We don't have to pay the tax. And what is the penalty that is payable? It depends. When the owner of goods is coming forward to claim release, or owner is not coming forward to claim release. If the owner is not coming forward to claim release, then who is coming forward? Transporter is coming forward to claim release. When the owner is coming forward, what will be the penalty? Suppose if it is taxable goods, the penalty will be 200% of tax payable. And if it is exempted goods, so it will be 2% of value or 25,000, whichever is lower. So this is the penalty payable under CGST Act. So the same amount of penalty. Remember, late fee provisions and penalty provisions will be so common for CGST and SGST. So whatever is the late fee and penalty that we compute for CGST, that will be applicable for SGST also. But in question, they will be usually asking so and so section of CGST Act. Then we need to write only one penalty. Okay. And suppose if they are asking penalty payable, so now you compute both under CGST Act as well as under SGST Act, and you show the amount. Okay. So this is penalty under CGST Act, 200% of tax payable for taxable goods, exempted good, 2% of the value of goods or 25,000, whichever is lower. Whereas what is the penalty for release of the conveyance? For release of the conveyance, a penalty will be penalty payable for release of goods or 1 lakh, whichever is lower. So therefore, in two places, the penalty comes as whichever is lower. So in the exempted goods, the maximum penalty is 25,000, whereas in case of release of conveyance, the maximum penalty is only 1 lakh. Suppose if the owner is not coming forward, what is the penalty? For taxable goods, the penalty will be 200% of tax or 50% of the value, whichever is higher. not whichever is lower, whichever is higher. So 200% of tax or 50% of value, whichever is higher. Sir, usually 50% of value is only higher. Now sometimes when the compensation cess is also involved, so the 200% of tax may be higher. For example, GST you take 14%. And compensation says somewhere like 18% you take. So then definitely it will be like more than 50% of the value. So due to that reason, so 200% of tax or 50% of the value, whichever is higher will be taken. Whereas in case of exempted goods, so 2%, here it will be 5% of the value of goods or 25,000, whichever is lower. For release of conveyance also same. So penalty payable for release of goods or 1 lakh, whichever is lower. So therefore the maximum penalty for release of conveyance is 1 lakh. So this is about the penalty in case of section 129. Now what is the time limit within which this penalty is payable? Again, are we required to pay any tax under 129? No. In case of situation 2, no tax is payable, only the penalty is payable. And the penalty payable for release of goods and conveyance, separately we need to pay that. If it is not paid within 15 days, what will happen? So rule 144 says that there will be recovery of penalty by sale of goods or conveyance detained or seized. So first they will dispose of by way of auction and they will realize the money. But in case of perishable goods, that 15 days can be reduced. Where the person transporting any goods or the owner of such goods fail to pay the amount of penalty under 129, that is within 15 days from the date of receipt of copy of order, the proper officer shall proceed for sale or disposal of the goods or conveyance through auction. And the set period of 15 days may be reduced in case of perishable or hazardous goods. Now they are realizing some money. What is that money? That is by selling that. So can it be entirely retained by department? No, because in the previous case they passed a confiscation order. Here they did not pass a confiscation order. So therefore, whenever they realize the proceeds, whenever 15 days we have not made the payment of penalty, they will dispose it off by auction, and first it will be adjusted towards the recovery process. That is, while conducting auction, some expenses will be incurred. So for that, then the payment of penalty under 129. So the balance amount will be given to the electronic cash ledger of the owner of the goods if they are registered. Otherwise, it will be credited to their bank account. Suppose if the person is not known, then the balance of the sale proceeds cannot be so paid within 6 months. So they will wait for 6 months, and within that 6 months, if no one is coming forward to claim that amount, so then it will be transferred to the consumer welfare fund. So this is about this 4 sections: section 67 read with section 130, section 68 read with section 129. Let's see the next aspect, that is types of offences and the penalty in case of those offences. So when it comes to offences and the penalty, so in this chapter we need to understand 4 aspects. Number 1, what are the various offences and that leads to penalties, and number 2, what are the offences that leads to imprisonment, number 3, what are the offences that leads to arrest, and finally what are the offences so which are compoundable. Compounding of offences, one concept is there wherein, so if you pay some compounding fee, so you will get immunity from the prosecution, that is imprisonment. So that is known as compounding of offences. So all these are connected. So first we will see, so what are the 4 aspects, what are the offences that leads to penalties, and second, what are the offences that leads to imprisonment, and then what are the offences that leads to arrest, and then finally offences which are compoundable. So this offence and penalties is a very, very important area, because so we have lot of amendments related to this offence and penalties topics. Okay, so let's see types of offences and that leads to penalty. First we have 122 subsection 1, bio discredits TFT. So these are the list of offences that you need to remember, and these offences, so full form I have given below. So what is that? Bio discredits TFT. B for books of accounts default. Books of accounts default means not maintaining books of accounts or maintaining false books of accounts or fake books of accounts, that is known as books of accounts default. I for invoice default. Invoice default means I am issuing invoice without supply, or I am supplying without invoice, or I am giving incorrect invoice. So that is called as invoice default. So books of accounts default, non-maintenance or false or fake books of accounts, and invoice default, supply without invoice. So I am making supply without invoice, or supply with incorrect invoice, or invoice without supply. or for obstructing an officer from doing duty. So an officer is coming into our premises for the purpose of inspection or any search, etc. So we stop the officer from doing his duties. Then D for dealing in goods liable for confiscation. So I am actually storing the goods which are liable for confiscation, selling the goods or buying the goods. So this is known as dealing in goods liable for confiscation, means unaccounted goods. If I am involved in any transaction related to unaccounted goods or goods without any invoice, then it is called as dealing in goods liable for confiscation. Then input service distributor default, which means that I am not supposed to take the credit, but I took the credit and I distributed the credit to my branches, or I distributed the credit in excess of the credit availment, that is known as ISD default. Or supply with GSTN of another person. So therefore, I am raising the invoice in someone's name and I am collected the GST from my customer. So that is known as supply with GST of another person. And in C, so bio discredits. So B for books of accounts default, I for invoice default, and O for obstructing an officer from doing duty. DIS, D for dealing in goods liable for confiscation, I for input service distributor default, yes, supply with GSTN of another person. Then credit C. In that C, we have collected an amount as tax or not paid within 3 months, collected tax not paid within 3 months. Remember, there are two aspects here. Collected tax not paid within 3 months. So which means that I am supposed to collect tax, I collected the tax and I did not pay within 3 months. So this is one aspect. The other aspect is collected an amount as tax. I am not supposed to collect the tax, but I have collected the tax and not paid within 3 months. That is known as collected an amount as tax. So representing as tax, I collected some amount. Then R for registration default. Registration default, non-registration. You are liable to get registered, but you have not got registered, or giving false information for registration. So you are giving some false information like fake documents, etc., and all for the purpose of registration, or forged documents. Then E for erroneous refund. You are not supposed to get the refund, but you claim the refund erroneously or wrongly. Then D for disposal of goods while detention or seizure is operational. So there is a detention order or seizure order that has been given with respect to a person, and which means that so that goods actually should not be dealt with. So seizure means automatically the possession is taken by the department, whereas detention means the goods will be still in that same place and you should not be touching those goods, or you should not be dealing with those goods, you should not be selling those goods. That is known as detention or seizure is in operation. Now you try to break the seal and you try to sell those goods. So then in that case, so the goods are in the department's place and you have barged into their place and you have taken those goods, so and you have sold it. So this is known as disposal of goods while detention or seizure is operational. And ITC default, you are not supposed to take the input tax credit, but you have taken the input tax credit, fake credits. Then tampering with material evidence. Say department has got some material evidence like some documents or diaries or etc. So which contains a sensitive information or tax evasion information. You try to tamper those documents or tamper the pen drives etc. so that the evidence is destroyed. So that is known as tampering material evidence. And suppression of turnover. So you have crossed the turnover, but if you cross the turnover, so a lot of provisions are attracting. So due to that reason, you try to suppress your turnover. That is bio discredits. Then TFT, T for TDS TCS default, F for failure to supply information or supplying false information or documents. Then T for transport related default. So these are known as transport related default means what? Transporting goods without valid documents. Okay. So these are the various offences under section 122 subsection 1, and these offences if committed by any taxable person means either registered person or a person liable to get registered, then the penalty will be 100% of the amount involved in the offence, that is tax or ITC or TDS TCS as the case may be, or 10,000 rupees, whichever is higher, that will be taken as the penalty. So it should be, already I told you the penalties should be computed separately for GST and separately for SGST. 122(1)(a). So 122(1)(a) is a person who is beneficiary. So means he is not a person involved in the offence, but he is a beneficiary to the offence and he retains the benefit also of the offence. Two aspects: at whose instance the offence is committed and who is retaining the benefit out of that offence, then that person, on that person. So this is on any person who is beneficiary means here basically at whose instance the offence is committed and he is benefiting out of that offence. Okay. So what are those offences? III, invoice default, ITC default and ISD default. Say for example, a person who created some fake registrations and using these fake registrations, some invoices are raised to the recipients and the recipients enjoy the ITC based on that. So now on the supplier registrations, there will be penalty under 122 subsection 1, whereas the under invoice default, because of invoice without supply, so therefore on invoice default 122 subsection 1, on the suppliers there will be like penalty, whereas on the recipient who availed the ITC without proper documents, so that is called as ITC default. So on recipients only also there will be penalty, but on the person at whose instance this offense is committed, who is a mastermind behind these offenses, so on that person the penalty will be levied under 122 subsection 1A. It is not the benefit that he has retained, the total amount involved in the offense, that is tax evaded or ITC availed or passed on. So that will be taken, not the amount retained. For example, 500 crores worth of fraud is involved, tax evasion is involved, but out of that 500 crores, 50 crores is the benefit that he derived. So not 50 crores, entire 500 crores will be taken as the penalty amount, 122 1A. Then 122 1B. This is a newly added provision. So this penalty is on e-commerce operator. So e-commerce operator already is covered under 122 subsection 1 under TDS TCS default. TCS default is there, but there is another penalty also here, 122 1B. What is that? E-commerce operator is allowing an unregistered supplier to make supplies through their platform. So unregistered supplier to make interstate supplies. Basically intrastate supplies are allowed, but interstate supplies, or allowing a person opting for composition scheme to make interstate supplies, or failure to furnish the correct details in GSTR 8. Suppose if it is related to TCS, so then it is already covered under 122 subsection 1, that is TCS TDS default. Okay, whereas if the e-commerce operator is allowing an unregistered person to make interstate supplies, or a person opting for composition scheme to make interstate supplies, or the e-commerce operator not giving proper details in GSTR 8, then the penalty will be 10,000 rupees or tax involved, whichever is higher. So this is a newly added penalty, and they can connect this with TDS TCS, the existing penalty also. Then 122 subsection 2. This 122 subsection 2 penalty is on the registered person. So this is not on any person, whereas 122 1 is on the taxable person, 122 1A is on any person, 122 1B is on e-commerce operator, whereas 122 subsection 2 is on registered person. 122 subsection 2 will come into the picture only when there is 73 74. As per 73, whenever there is short payment, non-payment, wrong availment of ITC, wrong utilization of ITC, or erroneous refund. So 5 cases: short payment of GST, non-payment of GST, wrong availment of ITC, wrong utilization of ITC, erroneous refund, on account of fraud, collusion, etc. That is, you have intention to evade. Then in that case, the recovery will be initiated under section 74. Whereas if there is no fraud and all, other than fraud, that is error, then there is no intention to evade, then the recovery will be initiated under section 73. Suppose if the recovery is initiated under section 73, so it is like a softer provision than 74, then in that case the penalty will be as per 122 subsection 2, wherein it says 10% of the tax involved, or 10,000 rupees, whichever is higher, that should be taken. 10% of the tax or ITC or refund, or 10,000, whichever is higher, should be taken. Whereas if it is on account of fraud, so means the demand and recovery is initiated under section 74. So there is an intention to evade. In that case, the penalty will be 10,000 rupees or 100% of the tax or ITC, whichever is higher, will be taken. So 73, 10% of tax or ITC or 10,000, whichever is higher. 74, 100% of the tax or ITC or 10,000, whichever is higher. And these both penalties is on registered person. And what are the reasons for which 122 subsection 2 comes? So 122 subsection 1 also gets attracted. So for that reason, one circular has been given which says that 122 subsection 1 and 122 subsection 2 are mutually exclusive. So only when there is demand and recovery under 122 subsection 2, that is 73 74, so only when a person is required to pay the tax or ITC, and along with that if penalty is levied, that is 73 74. The moment 73 74 is invoked, so then automatically the penalty will be under 122 subsection 2. So 122 subsection 1 will not be applicable. Suppose if recovery is not initiated under 73 74, then for recovering only the penalty, means there is no tax or ITC due by the person, so just the penalty is payable. For that reason 122 subsection 1 will be applicable. So remember, 122 subsection 1 and 122 subsection 2 are mutually exclusive. Then 122 subsection 3, so this is again on any person. Basically 122 subsection 3 is not on the main character, but it is on the supporting character. So a person who is not the main culprit in the offense, but he is assisting, in that case 122 subsection 3 will come. Offences where the person is not directly involved in any evasion but may be party to the evasion. Then what is the difference between 122 subsection 1A versus 122 subsection 3? In 122 subsection 1A, at whose instance the offence is committed and they retain the benefit of the offence. But 122 subsection 3 is they are not retaining any benefit of the offence, they are just a party to the offence. So in that case, or a person has been issued summons to appear before the officer but he did not appear before the officer, or a person has been asked to produce the documents but he did not produce the documents. So then 122 subsection 3 penalty will be there, which is up to 25,000 rupees. Up to 25,000 rupees means any amount can be levied, so the maximum amount is 25,000 rupees. Whereas in this case we don't have up to, always it will be the standard penalty. Then 123. 123 is on a person who is required to furnish the information written under section 150. As per section 150, so whenever department is asking a person so to furnish the information written about a particular person, if he is not furnishing that information written, so then a notice will be given to that person to furnish the information. Even after notice also, if he has not furnished the details, so within 90 days from the date of the notice, then the penalty will be levied under 123. So first 150 empowers the jurisdictional commissioner or officer authorized by him to seek notified person from filing information written. If they are not filing information written, a notice will be given. After notice, within 90 days, if they are not furnishing the information written, then the penalty will be 100 rupees per day, subject to maximum 5,000 rupees. Whereas 124 penalty is there. This 124 penalty is on any person required to furnish any information under section 151 fails to do so. So there is a person who is required to furnish some information under section 151. What is this information under 151 versus information written under 150? So basically 150 is about a particular person, but 151 is about the data. Say for example, I want to know the bank detail, like I want to know the name of the persons whose credits in the bank has exceeded more than 40 lakhs. So exceeded 40 lakhs. So I need the data of those people. Then it will be information under 151. I want to know the bank statement of a particular person, that is information written under section 150. So both cases we need to submit some information. Whereas in 150 there is a timeline. So that is standard time is there, notice is there, within 90 days if you are not giving, then only the penalty will come into the picture. Whereas in case of 151, so 151 the time will be given by the officer itself. So empowers the jurisdiction commissioner to call for information from any person relating to any matter dealt with the connection with this act, and normal cases it will be up to 10,000 rupees, up to 10,000 rupees. If it is a continuing offence means repeated offence, then 100 rupees per day for the failure period, subject to maximum 25,000. But here always it will be 100 rupees per day, subject to maximum 5,000 rupees. Then 152. 152 is any information obtained under section 150 and 151 cannot be used without giving the opportunity of being heard to the person concerned. So usually I will tell a standard example, that is like, say a department has got the bank statement of a person, and in that bank statement the credits is more than 40 lakhs. Now just like the department cannot ask the person so to register, because that 40 lakhs may be, more than 40 lakhs may be exempted turnover also. So due to that reason, so the department cannot question him by telling that the person is not registered, so they cannot invoke any action. So first an opportunity of being heard should be given. So they should give a notice asking for the person, so that we got information stating that your credits is more than 40 lakhs and you have not registered. So we wanted to know the reason why you have not registered. So based on that notice and based on the reply, so then only they can initiate any penal action on that person. Okay, so that is this 152. Information obtained under 150 and 151 cannot be used without giving an opportunity of being heard to the person concerned. Then 125 we have a general penalty, and the general penalty is always up to 25,000 rupees. Again all these penalties are under CGST Act. The same amount of penalty is payable under SGST Act, but we don't have any penalty provisions under IGST Act. Penalty provisions or late fee provisions we don't have under IGST Act. Now this general penalty is applicable in the case where there is no specific penalty that is prescribed. And 126 talks about the general disciplines relating to penalty. No penalty for minor offences. What is a minor offence? If the amount of tax or ITC involved in the offence is less than 5,000 rupees, then it is known as minor offence. So in case of minor offence there is no penalty. So on second case, suppose if the offence is easily rectifiable and made without a fraudulent intent or gross negligence, then also there is no penalty. No penalty in two cases: if it is a minor offence that is less than 5,000 rupees, not equal to 5,000 rupees, less than 5,000 rupees, or the offence is committed without fraudulent intent and it is easily rectifiable, then also penalty may not be levied. But here the power to waive of the penalty is not applicable in all the sections. Only those sections where we have up to an amount as penalty, in that case only the officer is having power to waive of the penalty. What are those cases? That is where we have up to
like amount. So 122 subsection 3. So this place 126 will be applicable. Again, general penalty also up to 25,000. There also it is applicable. 124 also up to 10,000. Here also this section will be applicable. So applicable in case of 122 subsection 3, 124 and 125. Then 127, only for levying penalty a notice to be given, and that notice will be given under 127, where proper officer is of the view that the person is liable to pay penalty and the same is not covered under any of the other proceedings. So any of the proceedings means like so suppose if there is a demand and recovery, so they will be anyhow giving an order, and if there is assessment order, already order is there. Apart from that, just to recover the penalty, how the notice and order can be passed, that is under section 127. He may levy penalty after giving a reasonable opportunity of being heard. Then 128 versus 126. 126 is waiver, power to waive of the penalty on the officer, whereas 128 power to waive of penalty on the government. So government may by notification waive in full or part any penalty referred to in 122 subsection 122 all sections, 123, 125 or any late fee, except 124 all the penalties can be waived off by the government. Even the late fee which is levied under section 47 for delay in filing returns also can be waived off. And 133, this is on the officer who is engaged with respect to certain duties under GST law, either the government officer or the person who is working in the GST portal. So officer engaged under this act willfully discloses any information or contents of any return otherwise than in execution of his duties. Suppose if he is sharing that information, taxpayers information in the return is a sensitive information, if that is disclosed with any other person, so then in that case on the officer the penalty will be up to 25,000 rupees or imprisonment up to 6 months or both. Unless the officer is required to disclose that information in execution of his duties, it's okay, otherwise this penalty will be applicable. So up to 25,000 or 6 months or fine. 6 months, that is up to 25,000 is a fine, or imprisonment of 6 months, or both can be levied. So these are the various offences that leads to penalties. And then we have offences that leads to imprisonment and offences that leads to arrest. Okay, so first we will see what are the offences that leads to imprisonment. So that is the next aspect we need to see. You can see that in the next page, imprisonment section 132, so page 164, it's amended area. So previously lot of offences were covered under imprisonment, but now it is only ICEBID, ICE bid. Okay, so what is that? I for invoice default. What are the invoice default? Two invoice defaults are there: supply without invoice, invoice without supply. So both these offences are covered here. And C, there are two C's actually: collected amount as tax, collected tax not paid within 3 months. But collected tax not paid within 3 months is not an offence for imprisonment, but collected an amount as tax, representing as tax you collected some amount and not paid within 3 months, so that is an offence for imprisonment. E for erroneous refund, you are not supposed to get the refund, but you claim the refund, so erroneous refund. Then B for books of accounts default, again I for ITC default. And D, there are two Ds: dealing in goods liable for confiscation, disposal while detention or seizure is operational. So disposal while detention or seizure is operational is not an offence for imprisonment, but dealing in goods liable for confiscation is an offence for imprisonment. So therefore whatever short forms that we remember in biodiscredits TFT, the same short forms: ICE bid, I for invoice default, C for collected amount as tax not paid within 3 months, B for books of accounts, E for erroneous refund, B for books of accounts default, I for ITC default, and C for, so that is D for dealing in goods liable for confiscation. So in these offences, plus abetting to commit or attempting to commit these offences. Abetting means supporting these offences, or attempt to commit these offences, you are trying to commit these offences. So in this case the imprisonment will be applicable under section 132, and the imprisonment will be for a particular period. And here what we have seen so far is when the imprisonment will be attracted. And see this note: collected tax but not paid within 3 months is not an offence for imprisonment, but collected an amount as tax but not paid within 3 months is an offence for imprisonment. Now what you need to remember is that the imprisonment schedule. The imprisonment schedule is very simple. So first we need to see what is the tax involved, tax or ITC involved in that particular offence. So if it is greater than 1 crore, then up to 1 year. If it is greater than 2 crores, then it is up to 3 years. If it is greater than 5 crores, then it is up to 5 years. That is in case of first time imprisonment. Okay, so first you need to remember 1, 2, 5, 135, 125, 135, 125, 1 crore, 2 crore, 5 crore, 135, 1 crore, 3 crore, 1 year, 3 year and 5 year. Okay, so you need to remember this way: 1, 2, 5 and 1, 3, 5. So this 1 to 5 is crores. okay. Then this 135 is years, 1 year, 3 years and 5 years, okay. But this is the maximum imprisonment. So there is a minimum imprisonment up to 1 year, up to 3 years, up to 5 years. But in all these cases, there is a minimum imprisonment of 6 months plus all these plus fine. So we have to pay fine also, and that fine will be imposed by the court which is passing the imprisonment order. But in this 1 crore point, there is one important point. What is that? This 1 crore provision is applicable only in case of invoice default. That to which invoice default? So invoice without supply, only in that case, invoice without supply, okay. Previously this was not applicable, now they have amended. So more than 1 crore is applicable only in one case. Which case? Invoice default. That to which invoice default? So invoice, issues invoice without supply, that is greater than 1 crore. But all other offences, so it will be applicable for more than 2 crores, more than 5 crores only. So other offences. But in that other offences also, books of accounts default will be up to 6 months or fine or both. So here other offences, what are these other offences? Sir, whether these other offences includes invoice default also? Yes, invoice default, both invoice default, that is supply without invoice or invoice without supply, okay. So in these both cases, in these other offences, what and all will come? ICE bid, ICE bid minus B. Because for books of accounts default, always the standard imprisonment is there if it is first time. See, if it is subsequent imprisonment, it's no doubt. So it is up to 5 years plus fine. 5 years plus fine, and the minimum imprisonment will be 6 months. So confusion will not come at all. So in all the case of ICE bid, in all the case of ICE bid, okay, in all the case of ICE bid, it will be subsequent imprisonment given means up to 5 years plus fine, and the minimum imprisonment for 6 months. There is no other provision. Whereas when it is first time offense only, so there is a difference in the provision. What is that you need to remember? First you need to check books of accounts default. If it is a books of accounts default, up to 6 months or fine or both, that will be taken as the imprisonment. And if it is other offences, okay, in that other offences, only if it is more than 2 crores or more than 5 crores, then only imprisonment will be applicable, up to 3 years, up to 5 years plus fine minimum 6 months. But more than 1 crore, only one offence, that invoice default. In that invoice default also, not supply without invoice, invoice without supply. See, supply without invoice is normal, supply without invoice is usual, and that is okay. But invoice without supply means because of this the other person will enjoy the ITC. So due to that reason, invoice without supply, more than 1 crore itself, imprisonment will be attracted up to 1 year and fine. So this table you need to remember. How to remember this? 3 simple point. Books of accounts default, always up to 6 months plus fine, 6 months or fine or both. Then so greater than 1 crore up to 1 year, but only in case of invoice default, that to invoice without supply. All other offences only greater than 2 crores. So greater than 2 crores, so up to 3 years, greater than 5 crores up to 5 years. Subsequent imprisonment always up to 5 years plus fine. So this is about the imprisonment table. Now when there will be arrest, remember arrest will be applicable in case of only 3 offences. So there is ICE bid which comes under imprisonment. So just because there is imprisonment, it does not mean there is arrest. So because the person will be taken into the custody, that is known as arrest. After the person is taken into custody, he will be produced before the magistrate, and the magistrate or court will be passing the imprisonment order. So there is a difference between arrest and imprisonment. A person can be imprisoned even without the arrest, but arrest means a person is taken into the custody, that is known as arrest, okay. So what are the non-bailable offences? So the non-bailable offences and arrest provisions we are discussing together. So remember IIC. So what is the third aspect we are discussing? First aspect we have seen what are the offences that leads to penalties, and the second aspect that we have seen is what are the offences that leads to imprisonment. Now the third aspect we are discussing what are the offences which are leading to arrest. So IIC, what is that IIC? Invoice default, ITC default, and collected an amount as tax and not paid within 3 months. IIC. In the case of this IIC, suppose if the amount exceeds 2 crores, then only arrest will be there. So if it exceeds 2 crores, then only arrest will be there. Otherwise, there is no arrest. Okay. Again, so there is something called as cognizable and non-cognizable. Cognizable means a person can be arrested without a warrant, that is known as cognizable. Non-cognizable means a person can be arrested so with warrant, that is non-cognizable. Cognizable means without warrant also we can arrest a person. Non-cognizable means warrant is required, okay. And all offences which are cognizable or non-bailable offences means the person who is arrested should be produced before the magistrate and he cannot be released on bail. Whereas non-cognizable offences are bailable offences. Warrant is required to arrest and those are arresting officer can grant the bail. So therefore always remember NC plus B and C plus NB, non-cognizable plus bailable and cognizable plus non-bailable. Okay, so now what are the offences which are cognizable? Cognizable are severe offences. So this IIC greater than 5 crores is cognizable plus non-bailable, and arrest can be made. Of course arrest can be made once it crosses 2 crores, and inform the ground of arrest and produce before the magistrate within 24 hours. Okay, whereas what is the imprisonment? As the amount exceeds 5 crore, definitely the imprisonment will be up to 5 years and fine minimum 6 months. Whereas if the amount exceeds 2 crore but does not exceed 5 crore, it is non-cognizable plus bailable, arrest can be made and ACDC can give the bail. So bail can be given. Suppose if the person who is arrested is not submitting any bail application, then in that case, then forwarded to the custody of the magistrate. And as the amount exceeds 2 crores, the imprisonment will be up to 3 years and fine. What about other offences? In case of other offences, there is no arrest. So arrest will not be there. Arrest cannot be made. And all these are called as non-cognizable and bailable, but that is something called as stupidity, because in law they gave it like that. So once arrest is not there, when arrest itself is not there, what is the need of calling it as bailable, non-bailable and all? So but in exam also you need to write this, no other go. Okay, so logically if arrest is not there, so bailability does not arise, but in the law it is given that when arrest cannot be made, those offences are called as non-cognizable plus bailable. So that's a drafting error which is made in the law. So when we interpret two different sections, we will be getting like this. So non-cognizable plus bailable, okay, and all other offences. So arrest cannot be made. So what are the offences that leads to arrest? IIC, invoice default, ITC default, collect amount as tax not paid within 3 months. If it is greater than 2 crores, arrest can be made. And if it is exceeding 2 crores but does not exceed 5 crores, it is non-cognizable plus bailable. If it exceeds 5 crores, it is cognizable plus non-bailable. So then the last area that we are going to see is offences and that lead to compounding of offences. So what is this compounding of offences? Compounding means granting immunity from prosecution. So whenever there is an imprisonment, the imprisonment order will be passed by the court, and thereafter before passing the imprisonment order, so we can request the officer to grant immunity from prosecution, so that the officer will withdraw the case from the court, and so that there won't be any imprisonment that will be passed. But the moment the imprisonment order is passed, the case cannot be withdrawn, so we cannot get the compounding of offences. So basically compounding means granting immunity from prosecution upon payment of a compounding fee by the offending person. And what is that compounding fee? That compounding fee will be ranging between 25% to 100% of the tax involved. Okay, so 25% to 100% of the tax involved. So that will be the compounding fee, and this compounding fee is as prescribed by the officer, and that will be ranging between 25% of the tax involved to 100% of the tax involved in this. In addition to this compounding fee, such person should pay tax, interest and applicable penalties also. So anyhow tax, interest, penalty is payable. Apart from that, compounding fee is also payable. And there is restriction on first time compounding. So what are the cases? Number one, invoice without supply. Invoice without supply, first time itself you cannot go for compounding. Invoice without supply not at all possible. First time compounding not possible. But sir, supply without invoice, yes, supply without invoice compounding is possible, but invoice without supply not possible, because that is regarded as a severe offense. And that's what I told you. Even in imprisonment also, invoice without supply is regarded as severe offense. That's why more than 1 crore itself there is an imprisonment up to 1 year plus fine. And then prosecution order is passed. That also I told you, once the prosecution order is passed, once the imprisonment order is passed, and thereafter they cannot grant any immunity from prosecution. And restriction on subsequent compounding, all these offences are compounding subsequently not possible, which means that compounding can be given to a person only one time during his lifetime. So only once during his lifetime he will get the compounding of offences. Subsequent compounding is not at all possible in respect of any offence. First time compounding itself is not possible with respect to invoice without supply or prosecution order is passed. And some special points in this regard: compounding is possible if prosecution is not initiated or during the prosecution also, but the prosecution order should not be completed. Okay, after initiation of prosecution, say already in the court the case is there, and during the time also we can pay the compounding fee, and upon payment of the compounding fee all proceedings stands abated, means the officer who filed the case will withdraw the case upon collection of this compounding fee. So that is about compounding of offences under section 138. So these are the provisions that we have. And related to this compounding of offences, there are some additional amendments also which I have given at the end of the That's It book. You can see that. So we have some additional provisions relating to compounding fee. So for compounding fee, they have notified so little extra amounts like 25% to 100%. In that 25 to 100 is a bigger region. So in that they have created some provisions. So you can see here compounding fee notified for various offences. So what are the offences that leads to compounding? First, imprisonment we will see. If you see imprisonment, that is ICE bid. Okay. So in case of invoice default, that to which default? Supply without invoice or invoice without supply? Invoice without supply is not at all possible for compounding. So therefore only supply without invoice. Okay. So then ITC default, then collected an amount as tax, and then erroneous refund, IICE. Okay, in these four cases, that is definitely invoice without supply not possible for first time compounding itself. So supply without invoice, and then next in ITC default, collected amount as tax not paid within 3 months, and erroneous refund. In this case, what is that they are telling? If the amount involved in the offence exceeds 2 crores, then up to 60% of the amount of tax evaded or ITC wrongly availed or refund, or 40% of such amount. Okay, whichever is higher. So for example, up to 60%. So department took 30%. So 30 or 40, whichever is higher, 40. Okay. Suppose if the department has taken 50. So 50 or 40, whichever is higher. So 50. So which means you just remember the range. What is the range? 40% to 60%. 40% to 60%. So 40% to 60%, any amount can be fixed by the officer. Actually, the general provision says 25 to 100. In that 25 to 100, in case of these offences, 40 to 60, if the amount is exceeding 2 crores, because exceeding 2 crores only there is imprisonment. Exceeding 1 crore, there is imprisonment only in one case, that is in invoice without supply, and that is not possible for compounding. Then suppose if it exceeds 5 crores, then it will be 50 to 75%. So 50% to 75%, 50% to 75% will be taken in this case. Then books of accounts default and dealing in goods liable for confiscation. So in these two cases, okay, so BD, books of accounts default and dealing in goods liable for confiscation, always it will be 25% of the tax involved. Then attempt to commit or abetting commission, so then also it will be the same 25%. So easily you can remember. So what is that? So there is ICE bid. In that ICE bid, for B and D, what is that? Books of accounts default and dealing in goods liable for confiscation, 25%, whatever may be the amount, more than 2 crores or more than 5 crores, 25% of the tax involved will be taken as a compounding fee. In other cases, in the remaining offences, wherever compounding is possible, so if it is exceeding 2 crores, then it will be 40 to 60%. If it exceeds 5 crores, 50 to 75% will be taken. However, where the offence committed by the person falls under more than one category, say for example, he is doing ITC default as well as books of accounts default, then in that case what will be taken? So then the compounding amount shall be the amount determined for which higher compounding amount has been prescribed. So therefore you go by with the higher compounding amount. What is that? 50 to 75 or 40 to 60 only will be taken. So this 25% will not be applicable, means along with this IICE and BD also is there. So then whatever compounding fee for IICE, that will only be taken, this BD related compounding fee will not be taken. That is what they have given. So this is one amendment related to compounding of offences. So we have completed. So offences and penalties, search and seizure. So then the next area that you can see, segment 19. Segment 19, demand and recovery under GST. So basically demand and recovery will be applicable. So there are two sections, two important sections, 73 and 74. Apart from that, other sections are also there, but 73, 74 are repeatedly asked the sections. So 73, 74 demand and recovery will be applicable in 5 situations. There is non-payment of GST, that is you are not have paid any GST, or short payment of GST. You have to pay some GST, but you paid lesser amount, or wrong availment of ITC. So basically just we have availed the ITC, but we have not reversed. For the purpose of making us to reverse also they can do that. That is the meaning of wrong availment or wrong utilization. So you have wrongly availed the ITC and you have utilized that, so for payment. So basically this wrong availment or wrong utilization should be understood as wrong availment and wrong utilization, because mere availment will not have any offence. So availment and utilization for payment of our liability or erroneous refund. So these are the cases for which 73, 74 will be applicable. So a show cause notice will be given. And what is the reason for that? So it can be on account of fraud, collusion, willful misstatement, suppression of facts, or contravention of provisions with an intent to evade payment of tax. So fraud, collusion, willful misstatement, suppression of facts, or contravention with an intent to evade. So there is an intention to evade that should be present, then 74 will be applicable. If there is no intention to evade, that is only error, so means there is no intention to evade, so 73 will be applicable. What is the time limit for issuance of show cause notice? So the show cause notice to be given, first order time limit we will see. In case of 73, the order should be passed within 3 years from the due date of furnishing annual return for a particular financial year. For example, if the financial year is 2023-24, for the financial year 2023-24, the due date of filing annual return is 31st December 2024. From 31st December 2024, the order should be given within 3 years. So within 3 years, the order should be passed if it is under section 73. So order under section 73. So that should be by, what is the date? 31/12/2024 na. So 25, 26, 27. So 31/12/2027 is the time limit by which order should be passed under section 73. And what is the time limit within which the notice to be given? From the order time, there is a notice that should be given at least 3 months before. Okay. So notice under section 73. So notice under section 73 should be given max by, so 39/2027. So between this notice and the order, there should be a minimum gap of 3 months. So this we need to maintain. So if this is the financial year for which the order needs to be passed, the order should be passed by 31st December 2027 and the notice to be given on or before 39/2027. So this is how we need to understand if it is 73. Suppose if it is 74, so then what will happen? Same financial year 2023-24. If this is the financial year, and then for this financial year, what is the due date of filing annual return? 31st December 2024, and from there within 5 years the order should be passed. So order should be passed within 5 years. So which means 31st December 2024, 25, 26, 27, 28, 29. So by 31st December 2029, the order should be passed. Order under section 74 should be passed by 31st December 2029, and the notice should be given at least 6 months before. So therefore, from the order date to the notice date, there should be a minimum gap of 6 months that needs to be maintained. So therefore, the notice, show cause notice or notice should be given by 36/2029. So this is notice under section 74 should be given by 36/2029, because there should be a minimum gap of 6 months. So this is in case of 73 and 74, time limit for order and time limit for notice. But remember, it is on account of non-payment, short payment, or wrong availment and utilization of ITC. But in case of erroneous refund, this 3 years or 5 years will be counted from the date of refund. Okay, so it is not from the due date of filing annual return, it is from the date of refund. You can see here, time limit for passing order 5 years from the due date of filing annual return for relevant financial year, whereas in case of erroneous refund, 5 years from the date of refund. And wherever 5 years comes for 74, in case of 73 it will be 3 years, and the notice in case of 73 there should be at least 3 months before. So the gap of 3 months should be maintained, whereas in case of 74 at least a gap of 6 months should be maintained. Whether a supplementary notice can be given? Yes, both in case of 73 and 74 supplementary notice can be given. Supplementary notice is for the purpose of giving a additional annexure to the regular notice, so that for these years, like for example, already for one particular financial year notice has been given, for a subsequent financial year also the same mistake is committed, same grounds. Okay, it should not be different grounds. So same mistake is committed, then rather than giving a new notice for the subsequent year, for the notice which was already given for the previous year, an annexure will be given, so that for these two periods, for these two financial years, a single order can be passed. So that is the objective. So the same grounds, if it is same grounds, a supplementary notice can be given. And what should be the amount mentioned in the order? The amount mentioned in the order is TIP, tax, interest and penalty. And what is a penalty? 122 subsection 2 penalty. So in case of 73, the penalty will be 10,000 rupees or 10% of the tax or ITC or refund, whichever is higher. Whereas in case of 74, it will be 10,000 rupees or tax or ITC or refund, whichever is, or 10,000, whichever is higher. So 100% of tax, here it is 10% of tax, that's the difference. And this penalty under 122 subsection 2. And here we have some discount with respect to payment of penalty. What is the discount? Suppose if it is 73 penalty you take, so this is the penalty. But if you pay this penalty before show cause notice, then in that case you don't have to pay any penalty. Suppose if you pay this like tax and interest, if you pay the tax and interest before show cause notice, then penalty is not payable. So completely it is waived off. If you pay the tax and interest within 30 days after show cause notice also, so within 30 days after show cause notice also, you don't have to pay the penalty. Suppose if you make the payment beyond 30 days from the show cause notice, you need to pay the regular penalty. So tax, interest and the regular penalty, whatever is the regular penalty, that will be payable. So this is in case of 73. Whereas in case of 74, if you pay the tax and interest before show cause notice, you need to pay 15% of the original penalty. If the original penalty is 1 lakh, 1 lakh into 15%, 15,000 you need to pay. So the remaining 85,000 will be waived off. Suppose if it is paid after show cause notice but before order, so notice is given but before order, if you are making the payment, so then you need to pay, that is within 30 days. Within 30 days from show cause notice, if you are making the payment, so tax you need to pay, interest also you need to pay, but penalty 25%. For example, 1 lakh means 25,000 you need to pay and remaining 75,000 will be waived off. Suppose if you miss that also, and thereafter within 30 days from the order, if you are making the payment, so tax you need to pay, interest you need to pay, and the penalty will be 50% of the total penalty. So 1 lakh is the total penalty, means 50%, that is 50,000 you need to pay, and remaining 50% will be waived off. Suppose beyond 30 days from the order, if you are making payment, you need to pay tax, interest and the regular penalty, whatever is the regular penalty, that will be payable. So you need to remember this timeline so that the question can be framed based on this. And then there is one more order called as 76 order. So this is 73 and 74 order, whereas 76 order is there. Remember, 76 order will come into the picture only when amount is collected as tax. By representing as tax, we are collecting some amount. So not just the tax collected. Okay. So amount collected as tax. Amount collected as tax but not paid, then only 76 will be applicable. And there is no time limit for giving the show cause notice. Notice can be given anytime, even after 3 years, 4 years, 5 years, 10 years also, notice can be given. But whenever the notice is given, from the date within 1 year, the order should be passed. But there is a time limit for giving the order and notice in case of 73, 74. But in case of 76, the advantage for the department is that there is no time limit for giving notice. Even after 30 years or 40 years also, they can give the notice. And whenever they give the notice, from there within 1 year, they need to pass the order. And this is amount collected as tax and not paid within 3 months. So therefore, the penalty will be 100% of tax or 10,000, whichever is higher, 120 subsection 1. And here one more important point is that interest, usually interest will be computed from the first date after due date till the actual date of payment. But in this case, the interest will be computed from the date of collection. So whenever it is collected till the date of payment, so for that period, for example, so somewhere 15th March it is collected. So from 15th March till the date you are depositing that money with the government, so the interest will be computed. And whatever money that is deposited with the government, so it will be transferred to the person who borne the incidence of the tax. So who borne the incidence of the tax? We unnecessarily collected GST from one customer na, so to that person it will be paid. Suppose if they are unable to identify that person, so then the amount will be transferred to consumer welfare fund, that is this. And then what is the time limit? So there are 3 orders, 73 order, 74 order and 76 order. Once the order is passed, what is the time limit within which we need to make the payment as per the order? That is tax, interest and penalty, whatever it is. So within 3 months from the date of the order, we need to make the payment of tax, interest and penalty. So or we need to go for appeal. If we are neither going for appeal nor we are making the payment as per the order, so then the recovery will be initiated as per section 78 within 3 months from the date of order, otherwise recovery shall be initiated as per section 78. Or we can go for appeal also. When we go for appeal also, we will pay the pre-deposit. So when we pay the pre-deposit, the recovery will not be made. Okay, so that's what within 3 months either we need to pay or we need to go for appeal. Then is there any installment facility available? Yes, there is a maximum installment of 24 months that is available. So under section 80, so whatever is the amount as per the order, we can request for payment by installment, but it is not no cost installment. So means there is the total amount that we need to pay as per the order will be principal, and thereafter when they give EMIs, so there will be interest on that. So maximum 24 EMIs they can be giving. Then there is one amendment here, that is whenever you make the payment, so before the order date or before the notice, as the case may be, so you need to intimate them. So where a person makes payment of the amount under 73(8) or 74(8) or 129(1) shall intimate the proper officer of such payment. So we need to intimate that we have made the payment under DRC 3. Proper officer shall issue intimation instead of order in DRC 5 concluding the proceeding. So this step we need to do, otherwise they will pass the order and recovery also may get attracted. Then other provisions. So we have section 75. So 75 talks about the general provisions relating to determination of tax as per the order. So in that already 3 orders we have seen, 73, 74 and 76. Stay granted by the court or GST for a particular issue, the stay has been granted by the court or GST. So during that period they cannot pass the order. So therefore the time limit of 3 years and 5 years will be extended for further period. 3 years, 5 years and 1 year will be 1 year in case of 76 can be extended for a further period. Say for example, stay granted for 6 months, usual time limit 3 years. Now it will be 3 years 6 months, 5 years 6 months, 1 year 6 months, like that we need to take. Okay, such period shall be excluded from the date of notice or order due date. Then next, notice issued under section 74 not sustainable in the court. So they have given a notice under 74 invoking fraud, but in the court we went and we said that there is no fraud involved in this case. Now in that case the same notice will be converted into 73 notice. When the same notice is converted into 73 notice, then whatever amount that they can recover as per 73, that only can be recovered. Suppose if that notice is given, that is notice which is under 74. So they have given a notice under 74 which is not sustainable in the court of law, and that notice under 74 is given within the time limit under 73. What is the time limit under 73? So that is 2 years 9 months. How 2 years 9 months? 3 years minus 3 months, 2 years 9 months from the due date of annual return. Then whatever notice given under 74 is within the time limit under 73. So can the recovery be made? Yes, that amount can be recovered. So using that notice itself. Suppose the notice is given under 74 is not within the time limit under 73. So beyond 2 years and 9 months from the due date of annual return, then the recovery cannot be made as per the amount in that notice. So means the same 74 notice can be treated as 73 notice, and if it is within the time limit, the recovery can be made. Okay, and then one more point. So whenever the matter is remanded back for fresh adjudication, that is we went to the court stating that it is not fraud, and the court is telling yes, it is not fraud, and the matter will be remanded back for fresh adjudication for redetermination. So why redetermination? If the notice is given within the time limit, 74 notice given within the time limit of 73, the redetermination may be made. That redetermination period should be taken as what? So after redetermination, from the date the matter is remanded back for fresh adjudication, within 2 years the tax should be redetermined and the order should be passed under 75. When the matter remanded back for fresh adjudication by the court or GST, demand order shall be passed within 2 years from the date of communication of directions. And then suppose if the notice is given for multiple financial years under 74, now with respect to those financial years for which the time limit under 73 is fulfilled, that amount only can be recovered. Say last 5 years, to recover last 5 years tax amount, they gave a notice under 74, but as per 73 we can recover the tax only for last 3 years. So the 3 years amount only can be recovered. So if the charges of fraud is not proved, if the notice was issued under 74 for multiple financial years and such demand order is not sustainable in the court, then with respect to those financial years for which the time limit under 73 is satisfied, redetermination can be made and order passed under section 75. Then proper officer shall grant adjournment for maximum of 3 times. So 3 times is the maximum adjournment that is possible, and interest is payable. Say in the order they have not specified that we need to pay the interest. Interest is a statutory liability. Whether it is mentioned in the order or not mentioned in the order, we need to make the payment of interest. And then amount mentioned in the order should not exceed the amount in the notice. If the notice is given for 10 lakhs, we cannot pass the order for 20 lakhs. So order can be for less than or equals to 10 lakhs only. So amount in the order cannot exceed the amount in the notice. Sir, penalty not specified in the order. So whether it is payable? No. Interest only, even if not specified in the order, we need to pay, but penalty only if specified in the order we need to pay, otherwise we are not required to pay. Then in case of self-assessed tax, what is called as self-assessed tax? Self-assessed tax means, so which is reported in GSTR1 but not paid in GSTR3B, that is known as self-assessed tax. So then in that case we have rule 88C. And which says that they will be giving an intimation and they will do the recovery. So due to that reason, direct recovery is there. There is no separate notice. So you refer to 88C. So with respect to this, you can refer to rule 88C. So as per rule 88C, what does it say? An intimation will be given, and thereafter, if you are not making the payment, so direct recovery will be made. That direct recovery is in terms of section 79. Then suppose if there is a similar issue which is pending in the High Court or tribunal, so till the time the judgment is coming, during that time order cannot be passed. So for that issue, so that period also will be excluded. Suppose 3 months the order is pending, like the issue is pending in the court of law, so order cannot be passed. So therefore the order time limit will be extended by 3 months. Similar issue pending in some other proceedings in GST or High Court or Supreme Court, such period shall be excluded from the due date of the order. Then these provisions are given in 75. So then 76 we have seen, and 77 tax wrongfully collected and paid. So treating intrastate as interstate and vice versa, we have made the payment. So we can pay the correct tax and get the refund. So we have discussed these refund provisions in refund segment, and what we are trying to understand here is that there is no interest and penalty. So just you pay the correct tax and get the refund of the wrong tax. Then 79 talks about direct recovery and what are the provisions for recovery. So recovery of tax, and here recovery of tax, so they have given various options for recovery of tax. So first what they will do, first they will deduct from any money owed from the government. So this is known as withholding of refund. Suppose we are required to get some refund from the government, from that refund they will be withholding that amount, that is known as deduction from any amount owed from the government. And sale of goods under the control of proper officer. Suppose if goods are seized by the proper officer, he will sell off those goods by way of auction, and whatever money realized, that will be adjusted towards the tax dues. Garnishee proceedings, that is recovery from a third person. So from the bank account or from the tenant or from the debtor, etc., they will try to recover the money. And sale of movable or immovable property, attachment proceedings. So they will attach the property and they will sell it off. As arrears of land revenue by the collector. So collector, how they will recover the arrears of land revenue? By making an announcement, etc., in that locality like that. Or as fine imposed by the magistrate. So magistrate fine, if it is not able to be paid, so arrest will be made. So that, and or through surety. So these are the various modes of recovery. And there is one point you should know, that penalty for self-assessed tax not recovered to 73. See, basically self-assessed tax they can do direct recovery under 79. Suppose if they invoke direct recovery under 79, what will be the penalty? There is a circular which says that the penalty will be up to 25,000, general penalty will be applicable. Suppose if they invoke 73, so in that case the penalty will be as per 73. So penalty for self-assessed tax not recovered to 73, not recovered through 73 is up to 25,000. As per CBIC circular. Then section 81. Section 81 talks about transfer of property to be void in some cases. Any amount has become due from a person, that is order has been passed. After the order has been passed, he creates a charge or transfer the property. So he tries to mortgage the property, pledge the property, or he tries to transfer that property to some other person. So that mortgage or pledge or transfer will be void. So that will not be considered as valid in favor of any other person with the intention of defrauding the government revenue. Such charge or transfer shall be void. Suppose if the charge or transfer is for an adequate consideration and the person who is purchasing it has purchased it in good faith and without any notice of pendency of the proceedings, then that transfer will be considered as valid. Okay, such charge or transfer shall not be void if it is made for adequate consideration in good faith and without notice of pendency of the proceedings under this act. Or suppose if the person has got the order and he is telling to the officer that, sir, I need to sell this property, then only I can pay the dues. So or with the previous permission of the proper officer. And tax to be first charge on the property. What does it mean? Tax to be first charge on the property means same as otherwise provided in IBC. So that is usually IBC law will prevail, like insolvency and bankruptcy code will prevail. Apart from that, suppose if there is any company which is going to liquidation, etc. and all, so whenever they realize the asset, the first payment will be paid towards that statutory dues. In that statutory dues, so indirect tax, GST is also a statutory due. And then provisional attachment to protect the revenue. Basically, in section 81, only when the amount has become due from a person, thereafter if he transfers, that is void. Suppose if the notice is given and the order is not yet passed, during that period if he transfers any asset, so that is not void now. So then if he transfers, then what is the relief available to the department? That's where 83 will come. Provisional attachment to protect the interest of the revenue. So that is whenever, so proceedings are started. So whenever there is a proceeding, that is notice or any proceeding that has started, and the department is having a doubt that he can transfer the asset, so department will attach the property, so provisionally. So they will pass an order for provisional attachment, but that provisional attachment will be maximum for a period of 1 year. Means within 1 year, they need to complete the proceedings and pass the order. After order, anyhow, if we transfer, that will be, like void. So provisional attachment of property, including bank account, after initiation of any proceedings under assessment or inspection, search, seizure, arrest, or demand and recovery for a period of 1 year from the date of order of provisional attachment. Okay, and there is one amendment in this case. Rule 159 says that suppose if they attach any immobile, like any cars or motor vehicles, etc., then the revenue or any property, the revenue authority or transport authority or such authority who has placed encumbrance on the movable or immovable property on the order of the commissioner shall remove such encumbrance on the written instruction from the commissioner to the effect or expiry of the period of 1 year. That is provisional attachment. The moment provisional attachment is passed on that asset, there will be an encumbrance. So which means that, so we cannot make the sale. So due to that reason, the moment 1 year is over, the provisional attachment order ceased to exist now. So then the officer should release that encumbrance on the property. That is this. Then section 84, continuation and validation of certain recovery proceedings. What does it say? Suppose if they have passed an order and on that order we went for an appeal. Order is for 5 lakhs and we went for appeal, and appellate authority enhanced it to 7 lakhs. So generally appellate authority cannot enhance it to more than amount in the order. So 5 lakhs, if they want to enhance it to 7 lakhs, for that extra 2 lakhs, they should give us an opportunity of being heard. But the appellate authority cannot give the notice. The commissioner will be directed to give the notice for that excess amount. Commissioner shall serve a notice for such excess amount, and appeal order shall be passed on such enhanced amount without adjudication order for the excess amount. Okay. So therefore, appeal order will be passed for that enhanced amount 7 lakhs. There won't be any adjudication order, just the commissioner will give a notice for the 2 lakh rupees. Okay. So that is this, without adjudication order for excess amount. And other proceedings means any proceedings, it can be under IBC also. And next there is a CBIC circular related to difference between 122(1) and 122 subsection 2. So 3 situations are given. Clarification number 1. So Mr. Amar, so I just converted that into example for understanding. Mr. Amar is a supplier, Mr. Balaji is recipient. Amar is raising invoice on Balaji, okay, without supply of goods, just the invoice without supply of goods. There is no supply of goods, which means Amar is not having a liability first of all, because he just raised the invoice and there is no supply, means there is no liability on Amar. When there is no liability on Amar, recovery under 73-74 cannot be initiated on Amar. So due to that reason, the penalty will be under 122 subsection 1, as there is no 73-74. Demand and recovery under 73-74 cannot be initiated because there is no liability. Consequently, penalty under 122 subsection 1, invoice default. Okay. Then clarification 2. Now what about Mr. Balaji? Based on the invoice which is given by Amar, there is no supply of goods. Balaji availed the ITC and he set off with his liability. Because he set off with his liability has come down, means there is, like, suppose if this fake ITC is not taken, his liability he would have paid. For example, 10 lakhs is his liability and the fake ITC is 2 lakhs. So instead of paying 10 lakhs, he will pay 8 lakhs. So then 2 lakhs is a short payment of tax. Now he need to pay the 2 lakhs. So as he is required to pay the 2 lakhs, they will be doing demand and recovery, because ITC availed and utilized for payment of liability. So he need to pay that. Because of this, there is a short payment of tax. So the demand and recovery will be initiated on Mr. Balaji. As demand and recovery initiated on Mr. Balaji under 73-74, so he has done a ITC default also, but penalty under 122 subsection 1 will not be applicable in that case. So penalty not leviable under 122 subsection 1 as 73-74 is initiated, okay, on Mr. Balaji. Then see the clarification 3. Mr. Amar is raising invoice without supply to Mr. Balaji. First of all, Amar is not having any liability. Due to that reason, no recovery under 73-74, but penalty under 122 subsection 1, that is invoice default. Then what Mr. Balaji did, he also raised invoice to Mr. Charan and without making supply, means he got a fake ITC and he made a fake liability. Liability also not real, ITC also not real. So therefore, there is no recovery on Mr. Balaji, because the liability what he has is not a real liability, and the ITC what he has taken is also not the correct ITC. So in that case, there is no liability on Mr. Balaji to pay to government, but he committed 2 offences. What are the 2 offences? Invoice default and ITC default. So for the 2 times he need to pay the penalty. So 2 times penalty is payable, one for invoice default, one for ITC default. Now what Mr. Charan has done, he took the ITC and he set off with his regular liability. So because of that, there is a short payment of tax. So there is a demand and recovery on Charan, because he need to make the payment of tax. As he is required to pay the tax, Charan is required to pay the tax. So due to that reason, there won't be any recovery from Charan or not. There is a recovery under from Charan. So due to that reason, 73-74 applicable. So 122 subsection 1 ITC default will not be applicable in that case. So that's where from these 3 examples, what you can remember is that, so section 122 subsection 1 and 122 subsection 2 are mutually exclusive. So that is about this demand and recovery. We are moving on to segment 24, which talks about exemptions from customs duty. Firstly, section 25, which says that, so government is having power to grant the exemption. So as per section 25, central government by notification in the official gazette exempt goods from payment of customs duty either unconditionally or subject to certain conditions. And these exemptions, we don't have the specific exemptions like this product is exempted or not from import or export, like that we don't have, but they have given broadly certain exemptions. In the first area that we have is with respect to section 13, 23 subsection 1 and 2 and then 22. So what is this all about? So section 13 talks about no duty on pilferage. So whenever the goods are imported and that goods are pilfered refers to petty theft. In that case, we don't have to pay the customs duty. Then section 23 subsection 1 is applicable when the goods are destroyed. So because of any accident on account of natural causes, etc. So then in that case, so when the goods are destroyed or abandoned, so we will be getting remission of duty. Remission of duty means first we need to pay the duty and we need to prove to the satisfaction of the officer that the goods are destroyed. So then thereafter they will be giving us the refund. That is with respect to 23 subsection 1 when the goods are destroyed. But when the goods are not according to the specifications, in that case you don't need that goods, so you don't have to pay the duty. So then it will be called as relinquishment of title to the goods. So you will be giving away the title to the department, so therefore you don't have to pay the customs duty. That is known as relinquishment of title to the goods. And then section 22 is applicable in the situation when the goods are damaged, not destroyed, but the goods are damaged, which means that there is a reduction in the value of the goods. So on account of the damage, then proportionately to the value of the damaged goods, you need to pay the customs duty. So for example, 100% goods means whatever is the customs duty payable. After damage, the goods capacity or value will not be 100%, it will be reduced. So proportionately you will pay the customs duty, that is known as abatement. So basically, when which section will be applicable? When 13 is applicable, when the goods are pilfered, and when section 23 subsection 1 is applicable, goods are lost, destroyed or abandoned. When 23 subsection 2 is applicable, goods are not conforming to the specifications. And when section 22 is applicable, damage or deterioration to the goods. Deterioration is reduction in value on account of efflux of time. So whenever the goods are like evaporation, or whenever there is a reduction in the quality of the goods, so that is called as deterioration to the goods. So therefore, when the goods are pilfered, section 13, and what is the title? No duty on pilfered goods. What is the advantage? Because of this, you don't have to pay duty. Then section 23 subsection 1, when the goods are lost, destroyed or abandoned, so you will have remission of duty. What is the benefit? First you need to pay the duty, prove that the goods are destroyed, then you will get the refund. So then in case when the goods are not conforming to the specifications, relinquishment of title to the goods means you don't have to pay the duty at all, so you give away the title to the department. So whenever there is damage or deterioration of the goods, section 22 abatement. So what does the abatement says? Abatement is like, so you will pay the duty proportionately based on the value of the damaged goods. So that is the benefit. So in case of section 13, customs duty not payable by the importer but payable by the custodian. The imported goods will be under the control of a person called as custodian or port trust authorities. So that particular custodian will pay the customs duty because he is responsible for that goods. So importer is not required to pay. What if the goods are restored? So custodian identifies the person who has stolen that goods and the goods are restored. In that case, so the customs duty will be payable by the importer, and thereafter the remission of duty will be given to the custodian. Then whether applicable in case of warehoused goods? No. So then when the pilferage should have happened? Pilferage should have happened so after unloading the goods. After unloading the goods, that is at the time or after unloading the goods, if the and thereafter, so before the order for clearance. Okay, so see the stage at which the pilferage should have happened. So the goods are in the transit. So after the goods are unloaded in the port or airport and before order for clearance, what clearance? Either before clearance for home consumption or before clearance for warehousing. At this stage, if the goods are pilfered, then only section 13 benefit will be applicable. So that's why in case of warehoused goods, section 13 benefit will not be applicable. Whereas if you see section 23 subsection 1, remission of duty, what is the benefit? First you need to pay the customs duty and prove to the officer that the goods are destroyed, and then you will get the refund with respect to that. Whether applicable in case of warehoused goods? Yes. So which means you can claim the remission of duty even after the order for clearance and before actual clearance. If you see here, first the goods are unloaded in the port or airport, thereafter order for clearance, and thereafter clearance for home consumption, or it may be cleared for warehouse and thereafter it may be cleared from the warehouse for home consumption. Now at this stage, before actual clearance, if the goods are lost or destroyed, we will get remission of duty. Means whether the remission of duty is applicable even before order for clearance? Yes. So the remission is applicable before order for clearance. So if you see section 23 subsection 1 and section 22, is applicable at this stage also, is applicable at this stage also. Okay, so at this particular stage also we will get, so anytime before actual clearance, after unloading and before actual clearance, that is about remission of duty. Then if you see 23 subsection 2, relinquishment of title, what is the benefit? We don't have to pay the customs duty in this case. And relinquishment, remember, not possible with respect to prohibited goods. Any prohibited goods or illegal goods that you have imported and thereafter they have identified that goods, now you cannot say I will relinquish the title, not possible. So therefore prohibited goods you cannot relinquish the title, you have to pay the duty and you need to face the consequences with respect to that goods. Whether applicable in case of warehoused goods? No. So it is not applicable in case of warehoused goods, because relinquishment should have done before order for clearance. So after unloading the goods and before order for clearance, if the owner does not want to take delivery of the goods, relinquishment of title to be done under section 23 subsection 2. Okay, so that is this case. But suppose if the goods are deposited in the warehouse, at that time if you feel like the goods are not according to the specifications, that is you file a bill of entry and you have taken the goods to the warehouse, and warehouse you have observed that the goods are not according to specifications, in that case the section 23 subsection 2 is not there, but in warehousing provisions one proviso is there, that is proviso to section 68. So as per that proviso to section 68, relinquishment of title is possible, that's what I have given, but relinquishment is possible under proviso to section 68 in case of warehouse goods, that's a different provision. Then so that is with respect to relinquishment of title. Then 22, abatement. So in case of abatement, what is the benefit? Customs duty payable at the discount in proportion to the value of the damaged goods. So based on the value of damaged goods, we need to pay the customs duty. So if you see the value of the goods imported, so value of goods imported is say somewhere 8 lakhs. 8 lakhs is the value of the goods imported, and customs duty payable on above, is somewhere like 3,25,000 is the customs duty payable on above. Now what happened to the value of the goods imported after damage? So value of goods after damage, value of goods after damage came down to 5 lakhs. If value of goods after damage is 5 lakhs, how much is the customs duty payable on above? So that is how the abatement is computed. So the proportionate customs duty will be payable. How to calculate that? Simple. So first for 8 lakhs it is 3,25,000. For 5 lakhs it will be how much? So what we need to do? We need to take 5 lakhs, okay, into 3,25,000 divided by 8 lakhs. Okay, for 8 lakhs it is 3,25,000. So 5 lakhs, how much is the proportionate amount? So that will come to, so 5 lakhs into 3,25,000 divided by 8 lakhs. So that comes to 2,03,125 is the customs duty payable on above. So therefore, what is the abatement that we have got? See, this is not abatement, this is the customs duty payable based on the damaged value of the goods. So what is the abatement? 3,25,000 minus 2,03,125 will be taken as the abatement. Okay, so that difference will come to 1,21,875 is taken as abatement. So this is how proportionately the abatement will be computed. So we need to take customs duty equals to value after damage into original customs duty divided by value before damage. So that's how we need to compute. Whether it is applicable in case of warehoused goods? Yes, in case of damage, but not in case of deterioration. When the deterioration should have happened? Before or at the time of unloading, the deterioration should have happened. So deterioration only before or at the time of unloading of the goods. So in case of warehouse goods, if it is deteriorated, we will not get any benefit. So that is with respect to this section. So remember, before the goods are unloaded in the port or airport, if the goods are lost in transit, first of all there is no levy, so we don't have to pay any customs duties. That is based on the Supreme Court case. And after the goods are unloaded and before order for clearance, all the 4 sections are applicable: 13, 23 subsection 1, 23 subsection 2 and section 22. Whereas after order for clearance and before actual clearance, only 2 sections are applicable, that will be remission of duty section 23 subsection 1 and abatement, that is warehoused goods, only 2 points. And remission of duty and abatement, apart from that, relinquishment of title is there, but that's in a different section. So that is proviso to section 68. Then we have section 21, which talks about derelict, jetsam and flotsam, which refers to whenever the goods are thrown into the sea, that is called as jetsam. and those goods which are thrown into the sea will continue to float, that will be called as flotsam. And derelict refers to the damaged parts of the ship, and that is whenever the ship got derailed, so there will be some damaged parts of the ship, that is called as wreck. So all goods derelict, so goods derail, like ship derailed and the goods are falling into the water. Then jetsam, goods thrown into the water to save the ship from sinking. Flotsam, those goods which are thrown into the water will continue to float. And wreck refers to damaged parts of the ship. If these goods are brought into the shore, okay, so brought into or coming into India, shall be dealt as if these goods are imported by the person into India, unless the goods are exempted goods, as if they were imported into India, unless proved to the satisfaction of the officer that they are entitled to be admitted duty free. That is about section 21. Then section 20 talks about re-importation of goods. So in this regard, there are two notifications, notification 45/2017 and notification 60/2018. What does notification 45/2017 says? First, a person is importing the goods. Whenever he imports the goods, he will pay the customs duty on those goods. So those goods are exported. So whenever the goods are exported, thereafter it is subsequently re-imported. So the first is import, then export, and thereafter re-import. Import, export, re-import. Import, export, re-import. Okay. First there is a import, and thereafter there is a export, and thereafter there is a re-import. In case of import, custom duty is payable. In case of export, what is that person doing? Is he claiming any incentive at the time of export? Yes, he is claiming incentive at the time of export. So at the time of re-import, so he should pay only that incentive what he claimed at the time of export, that is sufficient. He don't have to pay any customs duty on this re-importation. Same way, at the time of export, if the goods are exported for repairs and thereafter it is re-imported, at the time of re-import, that person is required to pay a customs duty on fair value of the repairs carried outside India plus freight and insurance both ways. So from India to outside India to India, that should be taken as a value for payment of customs duty. If export for repairs, upon re-import the customs duty will be payable. How much is the customs duty payable? Fair value of repairs. So why they use the word fair value of the repairs? If the goods are sent outside India for repairs, it may be covered under warranty. When it is covered under warranty, so we don't have to pay any amount towards that. But even then, we need to take what could be the value. If it is not covered under warranty, that should be taken, plus freight and insurance both ways should be added, that should be taken as a value for payment of customs duty. Suppose at the time of export, so import and at the time of export, suppose if it is happening that we are neither claiming any incentive nor it is exported for repairs, but normally it got exported and it is re-imported, are we required to pay any customs duty on re-import? No, we don't have to pay any customs duty on re-import. So that is based on this notification 45/2017. But they gave one condition. What is that condition? From the export to re-import, what is the time limit within which the goods should be re-imported? 3 years, and it can be extended for a further period of 2 years. So that is this, and we have some notes in this regard. Even IGST will be payable on the same value, not only the customs duty but also IGST is also payable on fair value of repairs plus freight and insurance both ways. Suppose if export is subject to export duty, at the time of export if we are paying export duty, upon re-import, whatever customs duty we paid at the time of export, we will be getting it as a refund. So that is refund under section 26. So that is this point. If export is subject to export duty, then upon re-importation, we will get the refund of customs duty paid at the time of export as per section 26. If the goods are exported under duty exemption or any duty remission schemes, etc., then in that case, the time limit for re-importation is 1 year, plus it will be extended for a further period of 1 year. And if the goods are exported or not subject to any incentive, so at the time of export we did not claim any incentive or exemption and not exported for repairs, then upon re-import the customs duty is not at all payable in that case. And the fifth point is that exported goods and imported goods must be same and the ownership should not have been changed. So the ownership should remain the same. And concession under this notification is not applicable to 100% TOU. Why? Because anyhow imports by 100% TOU, we don't have to pay customs duty. Also unit in free trade zone, also we don't have to pay customs duty on import. And public or private warehouse, we don't have to pay customs duty when we keep the goods in the public or private warehouse. And tobacco and petroleum products, so these are some notified goods on which, so the concession under this notification is not applicable. And then in case the goods are taken outside India for exhibition purposes, so this point point we have seen in GST that upon bringing it back within 6 months from the rate of export, on re-import customs duty not payable. Why? Because at the time when it is taken outside India for exhibition, we have not claimed any incentive, nor it is exported for repairs. At the time when it is imported back, we don't have to pay customs duty with respect to these goods. So that is in case of notification 45/2017. Then we have notification 60/2018. What does it say? So here the first is export. So first we are making export and those goods are imported and then it will be re-exported. So then in that case, what are the concessions that are available? So at the time of export, from export to import, it should be within a prescribed time limit. What is the time limit? In case the goods are exported for reprocessing, or that is whenever the goods are exported, why is it coming back? So is it because of remaking, refining or reprocessing, because of the manufacturing defects? Then it should come back to India within 1 year. Suppose if it is for repairing or reconditioning, it should be coming back to India within a period of 3 years. In case of notified goods, it will be 7 years. So there are some notified goods. We don't have to remember what are those notified goods. In case of that notified goods, it will be 7 years. In case of other than notified goods, it will be 3 years, and 10 years in case of Nepal and Bhutan. This is the time limit within which the exported goods should be imported. So for what purpose? Either repairs or reconditioning. And from the time it is imported, it should be re-exported. After doing the repairs, reprocessing or refining, reconditioning, etc., it should be re-exported. What is the time limit for that? 6 months. Plus it can be extended for a further period of 6 months, and here some conditions are there. So what is the benefit? First of all, here at the time of export to import and again re-export, here you are making import now. On this import, customs duty is not payable, and the condition is that import goods and re-export goods should be same, and importer at the time of importation executes a bond. So that is with respect to this. So notification 60/2018, export, then import, and then re-export. Now see this, suppose if there is any loss of imported goods during such operation, that is from the time we exported to the imported, or again from the time we imported to the re-exported, if there is any process loss at this stage. So this process loss is okay, and we don't have any restriction under this notification. That's what it says. If any loss of imported goods is noticed during such operation, that loss shall be exempted from whole of the customs duty, subject to satisfaction of ACDC, even if the quantity re-imported is short or low, as long as the nature and variety is same. Okay. So then next we have this 21 already we discussed. 24, denaturing or mutilation of goods. If you see here, section 20 which talks about concession with respect to re-importation, 21 derelict jetsam flotsam, and 22 talks about abatement, 23 relinquishment of title and remission of duty, and 13 is a different section, no duty on pilfered goods, and 24 talks about denaturing and mutilation of goods. In case of denaturing and mutilation of goods, what happens is that, so first of all, when the goods are imported which has high rate of customs duty and low rate of customs duty depending upon the purpose for which it is being imported. So if imported goods are having twin purpose, and depending upon the purpose, if the rate of duty is applicable, so now when you denature the goods, you will make it unfit for the other purpose, so that the applicable customs duty you will be paying. So owner of the goods will make request for denaturing, that is diluting the chemicals, and mutilation, breaking the machinery. Same way, when you import the machinery, say you have to pay high customs duty. When the parts of the machinery is imported, you need to pay low customs duty, but you don't need the machinery, but you need the parts of the machinery. You can break down the machinery into parts, and only the parts can be taken, and the remaining structure etc. will be so scrapped. Then in that case, accordingly the customs duty will be payable. Central government make rules regarding the same. Duty is payable as if the goods are imported in the denatured or mutilated form. That is about section 24. So these are the various exemptions that we have. The next segment that we are going to discuss is valuation under customs. So valuation under customs is very important chapter for practical, like exam purpose. So lot of practical questions will be based on this chapter. So basically this valuation under customs is only one section, that is section 14, and in this section 14 we have assessable value. So basically customs, we have specific duty method and ad valorem method. Specific duty method means when customs duty is payable based on the units of measurement, like when you are importing the goods, so per kg or per quintal or per square feet, like that, when we pay customs duty, that is known as specific duty method. Ad valorem method means when the customs duty is payable as a percentage of some value, that will be called as ad valorem method. In this ad valorem method, again we have two, that is called as, ad valorem method, tariff value and transaction value. Tariff value means what will happen, so the value will be determined by the CBIC with respect to some notified goods, so we will go with that value only, even if the transaction value is ascertainable and the value, transaction value is more or less than the tariff value, but we go by tariff value only if the goods are notified for tariff value. If the tariff value is not applicable, then we will go for transaction value. So what will be the transaction value? The price involved in the transaction will be taken. That is basically this. So what is the assessable value in case of import? That is transaction value is nothing but the CIF price. CIF price refers to cost, insurance and freight. So usually we need to know certain prices differences here. Ex-factory price. Ex-factory price refers to the price prevailing at the factory gate of the exporter is known as ex-factory price. Then FAS, free alongside price. Free alongside price means the price prevailing at the like port. So that is of the exporter. So but it is not including loading charges. So usually what we will do is that we will be taking ex-factory price to that ex-factory price. So there are few prices which we need to understand. Depending upon whatever price that is given in the question, we can be taking. So ex-factory price. So ex-factory price is one price, and then free alongside price. Free alongside FAS. FAS price is there, and then free on board price. Free on board, that is FOB price. So free on board price is there. Then cost, insurance and freight, CIF price is also there. Now how we will be getting free alongside price? To the ex-factory price you add, to the ex-factory price you need to add, so freight from factory gate of the exporter to the load port or airport. So freight from factory to load port, to loading port or airport. So that will be called as free alongside price. Now to this free alongside price, if you are adding, to this free alongside price, if you are adding loading charges, so there will be some loading charges that will be incurred. So in the port or airport, so that loading charges in the loading port or airport, loading not unloading, loading charges, that will be called as free on board price. Then to this free on board price, if you are adding freight and insurance from where to where, exporters port or airport to importers port or airport, so that will be called as CIF price, freight and insurance. So we need to add freight and insurance from exporters port or airport, to importers port or airport, then it will be called as CIF price. So basically CIF price will be taken as the assessable value. So that assessable value is nothing but FOB price plus insurance plus freight. FOB price, we need to take FOB price given plus certain adjustments we need to make to the FOB price. That adjustments is given below. So then we will be getting the revised FOB price. So to this revised FOB price, we need to add insurance and freight. Insurance ascertainable, then we will take actuals. Ascertainable means, so it is like, so at the time of import, the importer is aware of whatever is the insurance charges that is actually payable by him. Sometimes when the container is shared between the importers, so he don't know what is the proportionate insurance that he need to pay till the time the consolidation agent or the logistics operators is giving him the receipt for the purpose of insurance payment and freight payment. So that is called as ascertainable, not ascertainable. So therefore if it is ascertainable, actuals will be taken. If the insurance is not ascertainable, say the importer don't know as to how much is the insurance that he is payable because the container is shared between two importers, so then it will be 1.125% of FOB. What FOB? Revised FOB will be taken as the insurance. Freight. In case of freight, divide into two: ascertainable, not ascertainable. Not ascertainable, very simple. It will be 20% of FOB. Which FOB? Revised FOB will be taken. Suppose if it is ascertainable, if it is air freight, we need to compare between actual air freight or 20% of FOB, whichever is lower will be taken, because air freight is restricted to 20% of FOB. Suppose if it is other freight, that we will be taking actuals. And basically this freight shall include handling charges. So this handling charges is not at the place of import. So this handling charges, so this freight shall include handling charges not at the place of import. So means unloading charges in the place of import should not be taken. Even this freight will include ship demurrage charges, which is payable by the shipping company whenever they anchor the ship at a outer space. That ship demurrage charges will be included, and lighterage and bar charges for bringing the goods from the ship to the shore. So that is lighterage and bar charges, that will also be included. But remember, demurrage charges will not be included. There are two demurrage charges, ship demurrage charges and demurrage charges. Ship demurrage charges is payable by the shipping company for anchoring the ship at outer space, that will be included in the freight, whereas demurrage charges is payable by the importer when the goods are not cleared within the time limit. So that demurrage charges will not be included in the freight. Okay, so this should be taken. And what are the adjustments that we need to make to the FOB price? The first adjustment is with respect to commission. So commission is broadly divided into two, buying commission and selling commission. So buying commission is paid by the importer to his agent, whereas selling commission is paid by the exporter to his agent. So whenever the importer is paying commission to his agent, that will not be included in the value of imported goods, whereas whenever the exporter is paying the commission to his agent, that will also not included. But when exporter's agent, importer is paying, it's an indirect consideration to the exporter, so that commission to be included. So selling commission, commission to exporter's agent paid by the exporter. So when it is paid by the exporter, it will not be included, but when it is paid by the importer, it's indirect consideration, so it should be included in the value. The other name for selling commission is local agent's commission. So basically this commission is payable by the importer's agent, so importer to the exporter's agent, where the exporter's agent will be in India. So that's why the selling commission is also known as local agent's commission. And then second inclusion is that usually importer will be sending some material, molds and dies or any capital goods to the exporter for use in the manufacture of finished goods which are to be imported. So whenever which is imported here, so the exporter will not charge for the free of cost material which is given by the importer. So therefore the goods will be only for the conversion charges. But as we need to value the value of the imported goods, so we need to take, so whatever is the expense, like whatever is the amount charged by the exporter plus free of cost material sent by the importer to exporter should also be included in the value. So material sent by the importer to exporter, including capital goods or intangibles, these are included in the value either at the actual cost or at the apportioned cost. If it is capital goods, we need to apportion it, used in the manufacture of imported goods. Apart from that, any other expenses which is recovered by the exporter from the importer, suppose if it is before import, definitely it should be included in the value, like design charges, etc. If it is after import, so now we need to check whether it is as a condition of sale of imported goods or otherwise. If it is as a condition of sale of imported goods, like installation charges, even though it is incurred after import, it should be included in the value. Suppose if it is customization charges based on importer's request, it is to be excluded from the value. And remember, these intangibles should be procured from outside India. If these intangibles are procured in India, that will not be included. So these intangibles, whatever intangibles is there, this should be procured. This should be procured outside India, then only it will be included. If these intangibles are procured in India, then it will not be included. So these are the adjustments we need to make to the FOB price, and we get the revised FOB price. And next we have rules. So in which case the transaction value will not be applicable. Generally transaction value only will be taken in case of import, that is CIF price. But some cases the transaction value will not be applicable if the importer and the exporter are related, or price is not the sole consideration. Price must be the sole consideration. If it is the price is not sole consideration, transaction value not applicable. Unrelated persons, what if they are related, then also transaction value not applicable. Unconditional sale, so there should not be any condition specified by the exporter to the importer for this goods. And unrestricted sale, there should not be any restrictions. If there is any restrictions, it will not be applicable. Also one more case, whenever the proper officer is of the opinion that the value declared by the importer is not correct based on the comparable imports, then also the proper officer can reject the value declared by the importer. In these cases, transaction value not applicable. So customs officer shall not have any doubt about the truth and accuracy of declared value. If he has a doubt, he will reject. Suppose if the value is rejected by him, or in these cases, so transaction value not applicable, we determine the value as per rule 4. So rule 3 says assessable value equals to transaction value if these conditions are satisfied. Otherwise, assessable value equals to value of identical goods will be taken. So first T, that is transaction value. If not I, that is identical goods. TISDCR, you remember this? TISDCR. T for transaction value. If not transaction value of identical goods, if not similar goods, if not deductive value, if not computed value, finally residual value will be taken. So what does the identical goods say? Identical goods means that goods also imported goods having the same physical features and characteristics and produced in the same country. So we are importing goods from one country means the identical goods also produced in the same country, and whatever goods that we are importing, so is manufactured by one manufacturer, the identical goods should also be manufactured by the same manufacturer, preferably not compulsory, so then it will be called as identical goods. So imported goods having the same physical features and characteristics and quality, imported from the same country, imported from the same manufacturer preferably, then we will call it as identical goods. So that identical goods we need to take, and we need to make some adjustments. What are the adjustments we need to make? Adjustments with respect to difference in the quantity. For example, if we are importing 1000 units, but the identical goods are 2000 units, if they imported 1000 units, what could be the difference in the price? So that adjustment we need to make. And difference in the transportation cost. We are importing to one port, but the identical goods are imported to other port. Had the identical goods be imported to our port, what could be the extra transportation cost that we need to add? Then difference in the commercial level of importation. We are importing from one person, say manufacturer level, but the identical goods are imported from the wholesaler level. Had the goods are imported from manufacturer level, what could be the price? That adjustment we need to make. So these are the three adjustments we need to make to the identical goods, and thereafter if we have multiple identical goods, we need to take lowest of the identical goods available. Lowest of such values shall be considered. And rule 5, we will be taking assessable value similar goods. So first T, transaction value, identical goods, then yes, similar goods. So in case of similar goods, what is similar goods? Similar goods are also imported goods, and these are commercially interchangeable. For example, you are importing a refrigerator, so that refrigerator is a double door refrigerator. A single door refrigerator can be taken as commercially interchangeable, that is the meaning. So commercially interchangeable, but it should also be produced in the same country, produced by the same manufacturer preferably, but not compulsory. Now in this case, 4 adjustments we need to make. First, adjustment with respect to quantity, adjustment with respect to transportation cost, adjustment with respect to commercial level of importation. What is the extra adjustment that we need to make? The extra adjustment is difference in the materials and engineering work. So if the single door refrigerator to be converted to double door refrigerator, what is the extra cost? That usually what is the price difference between single door and double door? That difference we will be adding. That is the meaning of difference in materials and engineering work. And if we get more than one value, we will take lowest of such values. When the similar goods or identical goods is not possible, then rule 6 says we can interchange between deductive value and computed value. Either we can follow deductive value first and then computed value, or computed value first and then we can go for deductive value. So what does deductive value says? Rule 7, assessable value equals to deductive value. Deductive value means you take the price prevailing in India and reduce post importation expenses. What is the selling price in India? Immediately after importation you take that and reduce all post importation expenses, you will including the customs duty, so you will get the price at the time of import. Okay, so first you need to take selling price, so minus all post importation expenses including customs duty, you will get the price prevailing at the time of import. Then computed value is you take the cost of production and you add all the cost including the profit margin and up to the place of importation, so then it will be called as assessable value, that is computed value. So computed value, what we will do, we'll take the cost of production, profit and general expenses, freight and insurance, whatever we have seen. So then we will get the value at the time of import. Deductive value is reverse. So we will take the selling price of the imported goods or identical goods sold to unrelated buyers in India minus post importation expenses including customs duty, we get the deductive value. And rule 9 says assessable value is based on residual value, that is whenever the above is not possible, customs officer will determine the value based on the principles of valuation, and that will be called as best judged value or residual value as per rule 9. Now in this regard we need to understand one important aspect, so that whenever they have given X factory price in the question, so when the X factory price is given in the question, say for example the X factory price is somewhere like $1,000. X factory price is $1,000, and freight from factory to airport, or freight from factory to load port, okay, so that is somewhere like $200, and loading charges is $100. Then freight from outside India to India, freight from outside India to India is not ascertainable. Outside India to India is not ascertainable, not available. Insurance also not available. So when insurance also not available, then how to determine the CIF price? So we will be thinking that So we need to take first X factory price. So we will take X factory price, and that X factory price, so $1,000 we will be taking, no doubt, and add freight plus loading charges, this will be called as FOB price. So what is the FOB price? 200 and 100. FOB price will be $300, that is $1,300. FOB price will be 1,300, and this FOB itself is the revised FOB because we don't have any adjustments thereafter. Now to this revised FOB we need to add freight and insurance. So how much we need to add as freight? Usually when freight is not ascertainable, we will take 20% of FOB. So what is the 20% of FOB? $1,300 into 20%. So 1,300 into 20%, so that will be $260 will be taken. But remember, from this we need to reduce, from this freight of $260 we need to reduce, whatever is already considered in FOB. So this 200 plus 100, why? Because as per ICAI study material, they are telling whenever you are taking 20%, that 20% is from the factory gate of the exporter to the importer's place. Due to that reason, so this 200 and 100 which is already considered in FOB we need to reduce, minus already considered in FOB, already included in FOB. How much is the freight already included in FOB? So that will be like $300. Okay, so already included in FOB 200 plus 100, so that will be $300. It will be reduced. Okay, so then the freight will be negative. Yes, of course the freight will be negative. So 260 minus 300, so the 40 needs to be reduced because the maximum is 20% when the freight is not ascertainable. The moment when you take 20%, the 20% is all inclusive. The 20% is inclusive of freight and freight from exporter's factory to the importer's place. So therefore the $40 needs to be reduced because it will be minus. So 260, 20% of FOB minus already considered in FOB 300. So the remaining needs to be reduced. So therefore 40 we will do the reduction, and then insurance we need to take. So how much will be the insurance? Insurance will be 1.125% of FOB. So 1,300 into 1.125%. So 1,300 into 1.125%, that will be $14.625 will be taken. Now this will be the assessable value. So what is the assessable value? 1,300 minus 40 plus 14.625. So that will come to $1,274.625 will be taken as the assessable value in this case. So this is how we need to compute. Suppose in the same question, what if the assessable value is somewhere like $10,000. Okay, so that is the X factory price is somewhere like $5,000. Then what will happen? So then accordingly X factory price will be $5,000 na, and then freight and loading charges we will be taking freight, and thereafter we will take loading charges. And how much will be the freight? The freight will be taken as 200 and 100 exactly. The 200 and 100 will be taken. So this 5,300 will be taken as FOB price, and that FOB price will be revised FOB price. So 5,300. Now we need to add freight. So how much will be the freight? 20% of FOB. So $5,300 into 20%. So that comes to 5,300 into 20% comes to 1,060 minus already in FOB. How much is already in FOB? $300 is already in FOB. So the difference will be added here. So 1,060 minus 300, that will be $760 will be added. So don't add 1,060, add only 760, and thereafter insurance. So insurance will be as usual 1.125% of FOB. So 5,300 into 1.125%. So 5,300 into 1.125% will come to $59.625. So if you add this, this will be called as assessable value. So how much? 5,300 plus 760 plus 59.625. So that will be $6,119.625. So this is how we will be taking. Now suppose, what if it is like, so what is the extra point that we have? Only the ex factory price is given. Now a slight change we will be taking. So that slight change will be like, what if it is air freight and the actual air freight is also given as somewhere like $1,000. So we have the actual air freight, that actual air freight is $1,000. Then what will happen in that case? So air freight is $1,000. Air freight is $1,000 from exporters, port, exporters, airport. It is not port, exporters, airport to India, to importers airport, to importers airport. So then what will happen in this case? So in this case what we need to do is that we need to determine as to how much should be taken as the ex factory price. So say 5,000 is the ex factory price, no change in that. So ex factory price will be $5,000 and add freight, no doubt. So that will be the same, freight up to airport, okay. Then loading charges, that will also be same. So freight will be $200, loading charges will be $100. So revised FOB will be $5,300. So this is FOB price revised. Now what we need to do with respect to freight? Air freight will be compared with actual or 20% of FOB. So add air freight. So remember, this is important. So air freight, what we need to do, take actuals. What is the actuals? So actuals will be 1,000, not only 1,000 plus 200 plus 100. Why 200 and 100? So because when you are comparing 20%, the 20% is from the factory gate of the exporter to the importer's place. So therefore everything you take from the factory gate to the importer, that is, so 1,000 plus 200 plus 100. So that will be coming to 1,300 or 20% of FOB. What is 20% of FOB? 20% of FOB, already we computed 20% of FOB comes to 1,060. So 1,060, whichever is lower, which is lower, that is $1,060, and to this $1,060 minus already in FOB. How much is already considered in FOB? Already in FOB. So already in FOB is $300 that needs to be reduced. So then the remaining should be added as the air freight, that is 1,060 minus 300. So that will be 760. Sir, suppose if the actual air freight is somewhere like $500, what you would have done? So if the actual air freight is $500, 500 plus 300 plus 100, so that will be 900. 900 or 1,060, whichever is lower, 900. Then also already considered in FEB, we will reduce. What is already considered in FOB? 300. Then also we would have reduced that. So then what will be the, so amount 760 that we have taken. Then finally we will be taking insurance. So insurance will be same. Insurance will be 1.125% of FOB. So that is 1,060, what is the FOB price here? 5,300. So 5,300 into 1.125%. So that will be same, that is $59.625. So you need to add this. So how much it comes to? Same, $6,119.625 will be taken as the assessable value. Okay, so this is how we need to calculate even if air freight is given. So these are the multiple combinations which are possible. So please be careful with respect to this kind of questions that can be tested in exam. Now we are moving on to valuation in case of exports. So what should be taken as a value in case of export? So basically FOB price should be taken as the assessable value in case of export, and we don't have to make any adjustments to this. So just whatever is the FOB price given in the question, you take that. And we have some customs valuation rules in case of export. So that is rule 3 says we need to take transaction value, but this transaction value may be rejected by the officer. So if the officer is not satisfied that the declared value is genuine, and even if it is related party transaction value may be acceptable, and assessable value equals to, suppose if it is transaction value rejected, then what will happen? We'll take the value of like, kind and quality. What does that mean? Just like identical goods. So they are imported goods, they are exported goods, same physical features, characters, etc., produced in the same country and exported to the produced in the same country in India produced by the same person, preferably and not compulsory, and we need to make adjustments, same 3 adjustments: difference with respect to the quantity, difference with respect to the transportation cost, difference in commercial level of exportation. Suppose if multiple comparable transactions are found, lowest of such value will be taken. Then rule 5 talks about computed value. In computed value, we will take cost of production plus profit and general expenses. So that's why we will be getting computed value. And suppose if that is also not available, then based on the best judgment assessment, that is residual value, customs officer will determine the value. So based on the principles of valuation, and that will be taken. That is with respect to this exportation. Then we have valuation in case of import of second hand goods. So whenever you are importing the second hand goods, in form A, the overseas chartered engineer should certify as to how much is the value of the second hand goods. If he has given the certificate, that will be taken as a value. Whether the report of overseas chartered engineer is submitted in form A, yes, then that will only be taken as the value. Suppose if that information or that certificate is not available, then we need to get the valuation done through a chartered engineer empaneled in the customs houses in India. So that chartered engineer certificate will be produced in form B, but that will not be taken as a value. So there will be a comparison between value declared by the importer and value as per the report of the chartered engineer and the depreciated value of the goods. These 3 things will be compared. So on comparison of these 3 things, so what will happen? So if there is any doubt with respect to the value declared, so no, there is no doubt. So then the value declared will be taken. Means these 3 more or less it is the same. So value declared will be taken. Suppose if there is any doubt, so then a notice will be given to the importer and he need to give the explanation. After explanation, officer is satisfied, yes, then value declared will be taken. Otherwise, the officer will determine the value as per rules. So that is about the valuation in case of import and export, including the second hand goods. Baggage, page number 199, segment 29, baggage. Baggage refers to passengers' luggage, and we have certain concessions with respect to baggage, and in remaining cases, wherever it is dutiable, we need to pay baggage duty 38.5% on the baggage. So let's try to understand the rate of duty on baggage. Suppose if the concessions are over, that is after taking out the concessions, we have certain concessions on baggage. After taking out the concessions, what is the rate of duty on baggage? On baggage, if we have 3 articles, that is firearms, cartridges of firearms greater than 50, cartridges of firearms greater than 50. Then number 3, cigarettes exceeding 100, cigars exceeding 25, and tobacco exceeding 125 grams. In these 3 cases, the baggage duty will be 110%. The baggage duty is 110%. What are the 3 articles? Firearms, cartridges of firearms exceeding 50, cigarettes exceeding 100, cigars exceeding 25, and tobacco exceeding 125 grams. All other goods, the baggage duty will be 38.5%. 38.5% will be the baggage duty on other goods. So if cigarettes is up to 100, can we apply 38.5%? Yes. If the cigars is up to 25, can we apply 38.5%? Yes. If the tobacco is up to 125 grams, we can apply 38.5%. If the quantity exceeds that, on that excess quantity only 110%. Same way, cartridges up to 50, 38.5%. If the cartridges is exceeding 50, on that excess quantity only, we will be applying 110%. Firearms, always it will be 110%. So this is including social welfare surcharge. We don't have to add any social welfare surcharge on the top of that. This is including social welfare surcharge. So this is the rates of duty on baggage. So generally students will get confused with respect to that. That's why first I have given this rates. Then we will move on to concessions with respect to baggage. The first concession that we have with respect to baggage is personal effects, used personal effects. Whatever may be the value of used personal effects, you are not required to pay baggage duty on. What is the meaning of used personal effects? Which is used by the, which is for use by the person to meet his day-to-day necessities is known as used personal effects. So whatever may be the value of those used personal effects, we don't have to pay. So that is the first concession we have. You can see below in the note, used personal effects and travel souvenirs irrespective of value is freely allowed. Used personal effects, okay, your dress, cosmetics or whatever, perfume bottles, everything which you are using. What about travel souvenirs? When you visit a particular country, as a memory of visit of that particular country, you buy something and come. For example, people who go to Paris will definitely buy that Eiffel Tower model, okay, and they will be bringing it and they will keep it in their house to show off that they went to Paris. So this will be known as travel souvenirs. So whatever may be the value, but for that 10, 20 and all if you are bringing, that is not called as travel souvenirs. So 1 or 2 as a memory of visit. 10, 20 if you are bringing, you will become a dealer of travel souvenirs and therefore you are required to pay customs duty on that. So used personal effects and travel souvenirs. Sir, what about personal effects? So whether smartphones and all will come under personal effects? Yes, if it is used. If it is used means throw the box fully and then bring the phone. And so 2 phones usually they are allowing. 2 phones they are allowing, but otherwise with box and all you are bringing, so definitely that will be counted. So therefore people who go abroad to bring the iPhones and all, so yes they can bring, but they should not carry any box and all. So just the phone they should be bringing, okay. And 2 phones is allowed. For that 10, 20 phones and all if they are bringing, they will not get this concession. Used personal effects. That's the reason why all new goods and all, when they are bringing for giving gift to India, they will remove the tag, they will remove the sticker, they will perfume bottle and all, they will open and spray and they will bring, so that it will be counted under used personal effects. Then personal effects means things required for satisfying daily necessities but does not include jewelry. Jewelry will not be considered as personal effect at all. Means it's like, jewelry, even though you are wearing it, but even then it is not considered as personal effect. You need to pay the baggage duty on that. Then how, sir, what we can do with respect to that? At the time when you are leaving itself, you need to declare how much jewelry you are taking, and after declaring that, if the same jewelry you are bringing, because at the time of declaration they will take the scanning of this jewelry and all, at the time when you are coming back, if the same jewelry you are wearing, so you produce that and they will see the scanned images of that. If it is the same jewelry, you are not required to pay any baggage duty. Otherwise you will end up paying the baggage duty on that. Usually what happens, so these girls and all in India gets exported to abroad, so in the name of marriage, and when they are exported abroad, so these girls and all will be wearing lot of jewelry and there, because what to do? So parents want only son-in-law to be a foreign son-in-law only. They don't want Indian son-in-laws and all. So therefore they will export their product. And when they export them, so that girl will go there and she will not get accustomed, because there the lifestyle is completely different. They have to work like pigs and all, morning to night, and only weekends. That weekends also this idiot will be sitting and playing PUBG. So then that girl will return. When she is returning, she will bring the jewelry along with her. Whether she is required to pay the baggage duty? Of course, yes. If at the time of taking it, if she has not given any declaration, then baggage duty is payable, because jewelry will not be coming under personal effects. Then what about alcohol? Sir, will alcohol come under personal effect? That is not necessity. So therefore it will not be coming under personal effects. So that is the first concession. The second concession is laptop. A passenger of 18 years and above, 1 laptop computer is allowed. Is laptop coming under personal effect? No, laptop is not a necessity. That's why laptop will not come under personal effect. However, if a person is 18 years and above, 1 laptop is allowed. Suppose 2 laptops we are bringing, 1 laptop will be exempted, another laptop will become dutiable. What if one laptop and one tab is brought? Any one we need to show, the other one will be coming under dutiable. Then the third allowance what we have is the general free allowance. What is a general free allowance? If they are coming from Nepal, Bhutan, Myanmar, the two by air route, 15,000 rupees is the general free allowance. Don't say anything. The person is coming from Nepal, Bhutan, Myanmar, and the two they are coming by air. Then it will be 15,000. That is other than land route. Air means air, water, or train. Okay, not train. Air or water. So land route it will be nil. Air or water it will be 15,000 rupees is the general free allowance. Suppose if they are coming from other than Nepal, Bhutan, and Myanmar, if they are tourists of foreign origin, the general free allowance is 15,000. If they are other cases, 50,000. So what are the 4 points you need to remember in general free allowance? First, divide it into two. Passenger coming from Nepal, Bhutan, Myanmar, coming by land route, 0. Other cases, 15,000. Then other than Nepal, Bhutan, Myanmar, again divide into two. Tourist of foreign origin, 15,000. Other cases, it will be 50,000. And for infants, there is no general free allowance. That is, child not more than 2 years of age is called as infant. Otherwise, in the name of infant, 50,000 rupees worth of articles we will be bringing. Okay. So, therefore, child not more than 2 years of age, there is no general free allowance. Everything will be dutiable. Sir, what about diapers, etc. and all? That will come under personal effects. So, therefore, it will be anyhow exempted. Then jewelry allowance is there. Next allowance is jewelry allowance. First allowance we saw used personal effects. Second, laptop. Third, general free allowance. Next, look into 4, jewelry allowance. So, but this jewelry allowance is available only if they stay abroad for more than 1 year. Just like that, if they go and come, this allowance will not be given. So, their stay in abroad should be more than 1 year, and how much they can bring gold. If they are male passenger, 20 grams with a value cap of 50,000. Female passenger, 40 grams with a value cap of 1 lakh. So, this jewelry is purchased abroad, not taken from India. If the jewelry is taken from India, anyhow they would have given the declaration. When the same jewelry they are bringing, they are not required to pay baggage duty. Then this is for what? This is for the jewelry which is purchased there. Okay. And male, it is 20 grams subject to a value cap of 50,000. Means what? Suppose if the value of this jewelry, like say 25 grams, Mr. X, 25 grams with a tariff value, 25 grams with a tariff value of, so 1 lakh. So 25 grams with a tariff value of 1 lakh. How much will be allowed? 20 grams will be allowed. So how to calculate this 20 grams? Simple. First, 1 lakh is for 25 grams. So how much it is for 20 grams? 80,000 or 50,000, whichever is lower. So how much will be the allowance? 50,000. Therefore, what will be the dutiable value? Duty will be what? 50,000. On that, we need to pay 38.5%. Is it clear? Suppose if it is 25 grams, Mr. Y, 25 grams with a tariff value of 55,000, because for different quality of gold the rate will differ na. So if it is 18 carat, 22 carat, 24 carat, the rates will differ. That's why 25 grams with a tariff value of 55,000. So how to calculate this? Take 55,000 divided by 25 grams into 20 grams. How much? It comes to 44,000 or 50,000, whichever is lower. That is 44,000 we will get. So therefore duty we need to pay on what? 55 minus 44, that is 11,000 into 38.5%. Not always 50,000 is the allowance. 20 grams subject to a maximum of 50,000, which means first you need to see based on weight, then based on value, whichever is lower will be the allowance that is available. This is for male passenger. For female passenger, how much will be the allowance? For double, 40 grams with a value cap of 1 lakh. For female passenger, it will be 40 grams with a value cap of 1 lakh. This much is only allowed, not beyond that. And why sir they are giving this only? So because only Indians have fancy towards the jewelry, and people who are coming from abroad will not be having. So but some basic jewelry they will be wearing. That's why this much is only considered as basic jewelry for the purpose of customs. Then next, look into the next point. The free allowance of one passenger cannot be pooled with the free allowance of any other passenger. For example, husband and wife going abroad, each one carry one laptop, and they are buying one gaming laptop for their son, and they are bringing that gaming laptop to India, and the laptop value is 90,000. So husband is eligible for 50,000 allowance, wife is eligible for 50,000 allowance. Sum of these two will be 1 lakh. But we will get only 50,000 as allowance, which means 90 minus 50. So remaining 40 will be dutiable. Why not? It can be pooled because we have a condition that the free allowance of one passenger cannot be pooled with the other passenger. Then the general free allowance is not applicable in case of 6 goods. So whatever that 50,000 limit we saw in a general free allowance, 50,000, 15,000, that is not applicable in case of 3. The first 3 which is related to 110% duty. What are the first 3 related to 110% duty? Firearms, cartridges of firearms exceeding 50, cigarettes exceeding 100, cigars exceeding 25, tobacco exceeding 125 grams. Then number 4, alcoholic liquor in excess of 2 liters. Means up to 2 liters can we claim general free allowance? Yes. Then gold or silver in any form other than ornaments. Means like gold bars, gold biscuits, etc. we cannot claim general free allowance. Then for ornaments, can we claim general free allowance? Yes. Then LCD, LED, plasma TV, we cannot claim general free allowance. So tell me what are the 6 articles for which we cannot claim general free allowance? Firearms. Then cartridges exceeding 50. Up to 50 can we claim general free allowance? Yes. Cigarettes exceeding 100, cigars exceeding 25, tobacco exceeding 125. Up to that can we claim general free allowance? Yes. Alcoholic liquor in excess of 2 liters. Up to 2 liters can we claim general free allowance? Yes. Then gold or silver in any form other than ornaments. For ornaments can we claim general free allowance? Yes. Then LED, LCD, plasma TV. And for the first 3 what is the rate of duty? 110%. For the next 3 what is the rate of duty? 38.5%. Then what are the other entitlements to a passenger who is transferring his residence to India? Whenever a person is transferring his residence to India, then apart from the used personal effects, even he can bring the household articles also. And depends, if his stay in abroad is 3 months to 6 months, 0 to 3 nothing, 3 months to 6 months, last is what, 6 na? So he can bring 60,000 rupees worth of articles, household articles. What is that household articles? So mixer, grinder, then utensils, gas stove, refrigerator, all those things, okay. So 3 to 6, 60,000 worth of articles. 6 months to 1 year, 1 lakh worth of articles. Minimum 1 year in the preceding 2 years, 2 lakhs worth of articles. Minimum stay of 2 years or more, then up to 5 lakhs. This much worth of household articles can be brought. This is in addition to general free allowance, addition to jewelry allowance. And what are the ineligible articles? Annexure 1 is ineligible under this. Even Annexure 2 articles also ineligible. Whatever really they need, that they have kept under ineligible. Color TV, video home theater system, dishwasher, refrigerator above 300 liters. Up to 300 liters? Yes. You know what is refrigerator up to 300 liters? Single door. Single door refrigerator. Deep freezer, video camera, cinematograph film of 35 mm and above. Gold or silver anyhow covered under Annexure 1. So what articles can be brought? Mixie, grinder, iron box, kettle, sandwich maker, understood, plate, cup, saucer, okay, these things only can be brought. So these articles cannot be brought under this allowance. Then see the other points. All the above provisions are equally applicable to unaccompanied baggage. What is an unaccompanied baggage? I told you already, the baggage which comes within 1 month after his arrival or before his arrival, either before or after. But what is the time limit? You see the time limits there. 1 month after passenger's arrival, 2 months before passenger's arrival. Easily you can remember. A for after, B for before. Alphabet A is first alphabet. Alphabet B is second alphabet. So 1 month after arrival, 2 months before arrival. Okay. So what is called as unaccompanied baggage? The baggage which comes within 1 month after passenger's arrival, 2 months before passenger's arrival is known as unaccompanied baggage. For that also baggage provisions are applicable, but not unaccompanied baggage one time, accompanied baggage another time. Bag came, for that one allowance sir 50,000, again I am bringing something sir for that. No, for one visit only one time. You understood or not? So you decide between unaccompanied and accompanied. Then member of crew, people who work in the aircraft, ships and all, if they are in service, they can bring petty gifts up to 1,500 for personal or family use. They are not getting 50,000 allowance. If they get 50,000 allowance, half of the articles in India will be brought by them only. So they are not eligible for general free allowance. Only 1,500 chocolates, cosmetics. Which cosmetic come for 1,500? So therefore some petty things can be brought for 1,500 rupees only. But when they complete their service, contract gets over and they come now, at that time are they eligible for the general free allowance? Yes. Then passenger carrying non-dutiable and non-prohibited articles shall walk through green channel. Suppose if they are carrying any dutiable articles, they need to walk through the red channel and they need to make a true and full declaration regarding the contents of the baggage. Then there is a concept called as temporary detention of baggage. That is, when you are importing some dutiable articles, you don't know about the baggage provision. Say you went to abroad and you purchased one Sony LED TV and you brought that to India. Because people who go to this Dubai, Kuwait and all, they will be bringing that LED TV for their home. So you brought that LED TV and now there is no general free allowance. Full we need to pay 38.5%. But if you pay 38.5%, so the price is more or less the price in India. So therefore what you can do in that case, you can keep it there. At the time when you are returning, you take that and you return it there and you don't have to pay any baggage duty. That is known as temporary detention of baggage, where the baggage of a passenger contains any article which is dutiable or the import of which is prohibited and in respect of which a true declaration has been made. The proper officer may at the request of the passenger detain such goods for the purpose of being returned to him on his leaving India, and if for any reason the passenger is not able to collect the article may be returned to him through any other passenger or through courier or cargo sent to him. Then next, remember one important point in this, only if you make a declaration, then only this temporary detention of baggage is applicable. For example, you brought a bag full of gold biscuits and you walk through the green channel as if you did not bring any dutiable articles. You walk through the green channel and officer identified and he is asking you to pay the customs duty and you are telling, okay, temporary detention, next time when I return I will take and go. No, because you did not make true declaration. See there, only when a person has made true declaration, this temporary detention of baggage provision will be applicable, otherwise not. Then already we discussed what is the customs duty rates applicable on baggage. So with this we completed baggage provisions. Okay, warehousing under customs. So basically warehousing provisions deals with import of goods that can be deposited in the warehouse without payment of customs duty, and again at a later point of time we can clear it from the warehouse upon payment of customs duty. So let's have a overview into this particular warehousing provisions. You can see here first, as and when the goods are imported, that imported goods will be under the custody of custodian for a period of 30 days. So 30 days it will be under the control of custodian, and within 30 days either we need to present the bill of entry for home consumption or bill of entry for warehousing. Within this 30 days, if it is not presented, either the goods will be deposited in the warehouse by the customs officer or it can be disposed of by way of auction. Now in this 30 days period, we are filing a bill of entry for warehousing or inbound bill of entry. When we are presenting the bill of entry for warehousing, we also needs to execute a bond. So goods are cleared without payment of customs duty, but a bond needs to be executed. Now from this particular port or airport, so we will be taking the goods to either public warehouse or private warehouse or special warehouse. What is a public warehouse? Public warehouse is a warehouse where the goods belonging to any person can be deposited in that warehouse. So store goods belonging to any person. Whereas private warehouse means only goods belonging to the warehouse keeper can be deposited in that warehouse. That is called as private warehouse. So store goods belonging to license holder. Whereas special warehouse means store notified goods belonging to any person. So one of such notified goods already we have seen in stores, that is stores will be coming under notified goods. Apart from that, there are other notified goods, but the notified goods list we don't have to remember for exam purpose, but remember notified goods will be kept in a special warehouse. How public and private warehouse will be different? For example, I am having a warehouse, so and my goods only can be deposited in that warehouse, that is called as a private warehouse. I am having a warehouse, my goods also can be deposited, some other person's goods also can be deposited, that is public warehouse. Now how public and private warehouse is different from the special warehouse? Special warehouse will be under the physical control of the customs department, which means customs officer will be present in the special warehouse and it will be operated based on customs lock and key. Whereas private warehouse or public warehouse, it will not be under the physical control of the customs officer. It will be records based control, which means the customs officer will not be present, but the warehouse keeper need to follow certain guidelines as specified by the regulations in this regard. So that is about the private warehouse or public warehouse, records based control, but special warehouse physical control. But all these three warehouses are licensed by the customs department only. So commissioner or principal commissioner will give the licenses with respect to these warehouse based on certain licensing conditions. Now as the goods are deposited into the warehouse, so these goods, how many days it can be in the warehouse? So these goods can be in the warehouse for an unlimited period of time. So in this warehouse, even manufacturing and other operations are permitted in this warehouse. So we can carry out the manufacturing. For example, we can import the raw material or we can import the goods in unassembled or disassembled form, and we can do the assembly also inside the warehouse. So manufacturing operations are permitted inside the warehouse. And here what happens is that if the goods are imported by 100% EOU, so export oriented unit, EHTP, electronic hardware technology park, STP, software technology park, or private warehouse where the warehousing operations are permitted, they can keep the goods till the time they are clearing it for home consumption, and there is no interest also that they need to pay. Suppose if it is any other warehouse, in that case they can deposit the goods maximum for a period of 1 year, and this 1 year can be extended for a further period. Sometimes the 1 year can be reduced in case of perishable goods also, but as per the law, the maximum period is up to 1 year, and in this there is an interest free period also, that is 90 days. So which means both these things should be counted from the warehousing order. So from the warehousing order, it can be deposited for a period of 1 year. In that also 90 days is the interest free period. From 91st day we need to compute the interest at the rate of 15% per annum. Remember, the interest rate under customs is 15% per annum and it is not 18% per annum. And from warehouse, for what purpose it can be cleared? Either it can be cleared to another warehouse, or it can be cleared to the importer's place, or it can be exported. Suppose if it is cleared to another warehouse, what reason? Maybe this particular warehouse where we have deposited the goods, they have cancelled the license with respect to this warehouse, then we will remove the goods from this warehouse to another warehouse. In that case, what are the formalities? We are not required to file any new bill of entry because already we filed a into-bond bill of entry. Only when we clear it for home consumption, we need to file ex-bond bill of entry. So we don't have to file any bill of entry, but just a transfer request we need to make. And again, no need to execute a new bond. Already the bond that was executed at the time of deposit of goods in the first warehouse, that itself will be sufficient. So no bill of entry, but a transfer request to be made. Customs duty not payable and the bond will be retained. Suppose if the goods are taken for importer's place, so what will happen? So that is for home consumption. Ex-bond bill of entry needs to be filed and the customs duty is payable, and the bond whatever is executed will be released upon payment of customs duty. And here there is one like two Supreme Court cases, Kesoram Rayan case and SBEC Sugars case by Supreme Court, which says that if the goods are not cleared within the permissible warehousing period, on expiry of the warehousing period, the goods are deemed to have been removed for the purpose of collection of customs duty. So usually we will take the relevant date for determination of rate of duty on the date of ex-bond bill of entry. But suppose if what happens, the warehousing period is over and thereafter we are filing the ex-bond bill of entry, the date on which warehousing period got over, on that date whatever is the rate of duty that should be taken, not the date on which ex-bond bill of entry is filed. But usually we will take the rate of duty prevailing on the ex-bond bill of entry. So this is because of the Kesoram Rayan case and SBEC Sugars case. They are telling that if the goods are deposited in a warehouse and the permissible warehousing period is expired, on expiry of the warehousing period the goods are deemed to have been removed and we need to do the computation of customs duty and collection will arise. So that is this, goods deemed to be improperly cleared on expiry of warehousing period. And then for clearance to the importer's place, ex-bond bill of entry for home consumption needs to be filed, cleared upon payment of custom duty, and bond executed will be released. Or the goods can be taken to export from the warehouse. When the goods are taken from our export, we don't have to pay customs duty because goods did not cross the customs barrier. So we don't have to pay customs duty on the import. And whenever we are exporting, we need to file a shipping bill or bill of export. That formality is only to be done. So no bill of entry, but a shipping bill needs to be filed. Customs duty not payable and the bond will be released because the goods are no more in the warehouse. Then when the goods are in the warehouse, so owner of the goods is having certain rights. What are those rights? Number one, so owner can inspect the goods. So he can check with respect to those goods at time to time and he can sort or inspect the goods, so sorting of the goods and showing them for sale. But the warehouse keeper so has to put certain restrictions to ensure that the goods are not damaged. Even the importer should, the owner of the goods should exercise care and caution to prevent the loss, deterioration or damage, because if there is any damage or loss at the warehouse stage, then in that case we will be claiming remission of duty or abatement. So that is loss of revenue to the government. So that's why this caution needs to be exercised by the owner of the goods. And see some more points in this regard. So come back to page 220. Imported goods can be deposited without payment of customs duty in a customs warehouse. Basically that is licensed by the customs department. So the types of warehouses, if you see it, we will have public warehouse, private warehouse and special warehouse. So section 57, 58 and 58A. And in public warehouse, goods belonging to any person can be deposited, but in a private warehouse only goods belonging to licensee can be deposited. Only notified goods can be deposited in special warehouse, which will be under customs log. If warehouse license is cancelled, yes, there is a possibility of cancellation of license. So if the licensing regulations are not met, so then the warehouse keeper so has to surrender his license, like his license will be cancelled. Suppose on account of breach of conditions by the license holder, goods deposited in such warehouse should be transferred to another warehouse, or it should be cleared for home consumption, or it should be exported within 7 days. Within 7 days from the date on which cancellation order is served. So any of these three things should be done. Either it should be transferred to another warehouse or cleared for home consumption, or it can be even exported. And at the time when we deposit the goods in the warehouse, we need to execute a bond that is called as warehousing bond. And that warehousing bond is 3 times the customs duty payable on such goods. So we need to execute. So warehousing bond is required for deposit, which is of 2 types, consignment bond and general bond. So consignment bond will be 3 times the duty payable at the time of deposit. General bond as specified by the officer. Upon execution of the bond, the proper officer will pass a warehousing order. Of course, in bond bill of entry needs to be filed and warehousing order will be passed. And what is the warehousing period? 1 year from the date of warehousing order. Considering the nature of goods, it may be reduced or enhanced, and this period is not applicable to EOU, EHTP, STP and warehouse where the manufacturing operations are permitted. And interest free period is 90 days and thereafter at the rate of 15% per annum from 91st day after the date of warehousing order till the date of actual clearance and payment of customs duty. We need to pay the customs duty along with the interest that is applicable. But remember, interest computation don't apply Kesoram Rayan case. For interest computation, we need to take till the date we are actually removing the goods and paying the customs duty. But the Kesoram Rayan case is only for determining the rate of duty. But when we actually file the ex-bond bill of entry and clear and pay the duty, until that point of time, interest computation needs to be made. So be careful with respect to this. And manufacturing and other operations are permitted in the warehouse, and duty not payable on such warehoused goods if processed goods are exported. So we have imported some raw material, we process some goods and we have exported that goods. Now on the imported material, we don't have to pay any customs duty. However, there will be some waste and scrap which will arise during the manufacturing stage. So what is the treatment of that waste and scrap. So that waste and scrap, if it is destroyed, we don't have to pay customs duty. Otherwise, if the waste and scrap is cleared for home consumption, then we need to pay customs duty as if waste and scrap is imported at the rate applicable to that waste and scrap. However, customs duty payable on waste and scrap at the applicable rate to waste and scrap arising out of manufacture if such waste and scrap is not destroyed within the warehouse. Then in case of volatile goods, so we will be able to claim the remission. So customs duty not payable on the quantity lost on account of evaporation or other causes. So that is with respect to volatility. For example, whiskey is imported and we have kept it in a barrel, and that whiskey imported, one barrel is some 1000 liters, and at the time of actual removal only 970 liters is there. Now on the 30 liters we don't have to pay customs duty. That is what section 70 says. So in case of volatile goods, we have some allowance that is available. So these are the provisions that we have with respect to warehousing. And next we have, so segment 31, page 223, refunds under customs. So in this refunds under customs, so basically we have three sections which talks about the refund. Section 26, which is refund of export duty, and 26A, refund of import duty, and section 27. So normally when we pay customs duty in excess, so when section 26 is applicable. Section 26 we have seen already in the context of section 20. Whenever the export is happening, on export we are paying the customs duty, and those exported goods are being imported. So then at the time of import of that particular goods, so whatever customs duty we paid at the time of export, that we will get as a refund. So goods exported on payment of duty and imported otherwise than as a resale, which means that it will be like rejections or returns only. So it should not be resale. Like I am selling to B outside India and B sell to C, and from C I should not buy. That is not allowed here. So I am selling to B means B should return the goods or B should reject the goods. Then this section 26 will be applicable. So here 100% of the customs duty paid at the time of export we will get as a refund. And what is the time limit within which the exported goods should be re-imported? 6 months, and it can be extended for a further period of 6 months. So basically it is 1 year. So goods should be imported within 1 year from the date of export. So from the date of export, the goods should be imported within 1 year. So 1 year usually is applicable in which case? So when we are exporting and when we are importing. So usually in case of remaking, reprocessing, refining, so there only it is possible export goods will be re-imported within 1 year. And refund is subject to unjust enrichment. Actually this is not applicable. Refund subject to unjust enrichment is not applicable in case of section 26. So this is not applicable, you just omit that. And how much refund we will get? 100% of the customs duty paid on export we will get. What is the time limit? 6 months from the date of order of home consumption. So 6 months from the order for home consumption we will get the now we can make the application. So after the date the goods are exported, the goods are imported now. So from the time it is imported we can make application within 6 months, and export to import the time limit will be 1 year. And here customs duty not payable on re-import on account of section 20. Yes, that's what we have seen. Whenever the exported goods are imported for the purpose of repairs, remaking, reprocessing, we have that notification which says that we don't have to pay customs duty, so that will be applicable. So these are the various provisions, like various points related to section 26. Now look into 26A. 26A is applicable in a scenario where the imported goods are defective, but we don't know that it is defective at the time when we are clearing it for home consumption, and after clearing it for home consumption we came to know that the goods are defective. Then in that case, is there any relief? So basically if you see that section 13, 22, 23 subsection 1, 23 subsection 2 is before the time of clearance. But what if we have cleared and thereafter we came to know that the goods are defective? Then in that case 26A will be applicable. So first, imported goods are either exported or destroyed or relinquishment of title. So basically, so we have relinquishment of title. Abandoned means we are relinquishing the title with respect to that. So exported, destroyed or abandoned. So that is we relinquish the title as they are not conforming to the specifications or defects. So what is the time limit for application? So we need to make application within 6 months from the late export order. So in case if the imported goods are exported or if the goods are destroyed from there within 6 months, and suppose if the goods are abandoned, that is relinquish the title, from there within 6 months we need to make application for refund of customs duty paid on import. How much is the refund? We will get 100% of customs duty paid on import, and the goods must be exported, destroyed or abandoned within 30 days, or it can be extended for a further period of 3 months from the date it is imported, cleared for home consumption, and it should not be used, and we should not claim duty drawback. So if you claim duty drawback, already you are enjoying the benefit. Imported goods exported, you are getting the duty drawback, then you will not get the customs duty refund in case of 26A. So remember, section 74 subsection 1 duty drawback and 26A are mutually exclusive. And then So here we have relinquishment of title that we come across in 3 different places. So what are the 3 different places where we come across relinquishment of title? So relinquishment of title we have under section 23 subsection 2. So in section 23 subsection 2 we have relinquishment of title. Again, proviso to section 68. Proviso to section 68 also we have relinquishment of title. Again, in this place we have come across relinquishment of title, that is section 26A. So when this relinquishment of title under 23 subsection 2, so at which stage we need to make? Before the order for home consumption or warehousing, before the order for clearance, before the order for clearance, before the order for clearance. Okay, whereas when the relinquishment of title under proviso to section 68, warehoused goods, with respect to warehoused goods we can claim the relinquishment of title under proviso to section 68, whereas 26A, that is after actual clearance, after clearance within 30 days plus 3 months, within 30 days plus 3 months. So this is the time limit by which we need to claim the relinquishment of title. So that is what it is given here. Then section 27 talks about customs duty paid in excess. So whenever customs duty is paid in excess by mistake, so in that case we will get the refund. What is the time limit for application of refund? So within 1 year from the relevant date. What is the relevant date? Depending upon the situation. So whenever we pay the customs duty, from there within 1 year. If the refund is on account of judgment, decree or order, 1 year from the date of judgment, decree or order. If the refund is on account of special order, 1 year from the date of special order, like that. So 1 year from the relevant date, usually the date of payment. And what is the amount of refund? 100% of the customs duty paid on import or export we will get as a refund. Other points, refund amount should be equal to or more than 100 rupees. And here refund is subject to unjust enrichment, means we need to prove that. So we have not transferred the burden to the next person. And refund application within 1 year is not applicable if the duty is paid under protest. So there is no time limit. So if the duty is paid under protest, protest means you don't want to pay the customs duty, but you want the goods. So you pay the customs duty and under protest you get the goods, and thereafter you make an appeal stating that you are not willing to pay the customs duty because this is not the customs duty that you need to pay. So that is called as payment of duty under protest. In that case the refund, there is no time limit. So even beyond 1 year also you can make the application. So once you make application for refund, within 3 months they need to grant the refund. In case of GST it will be 60 days, whereas in case of customs 3 months they need to grant refund from the date we make application. If the refund is not granted within 3 months from the date of application, then interest will be receivable by the importer or exporter at the rate of 6% per annum. Here the interest rate is same, 6% per annum. So for the period beyond 3 months, there it is 60 days and the interest rate is same, 6% only. Here it is 3 months and the interest rate is 6% per annum. So this is about the provisions, like important points related to refunds. So with this we have completed customs, all the portions, and now we are moving on to foreign trade policy, segment 32. So this foreign trade policy is actually, previously it was guaranteed area, but now as they have reduced the weightage of the customs to 20 marks, I don't think so they will be asking a question on foreign trade policy for like definitely. So may or may not be asked, but there are some standard areas which are very, very important in foreign trade policy. You need to focus on that particular areas, and this particular lecture you please quickly have a look into this revision lecture, plus whichever areas I am telling as important, those areas you mark and you please revise those areas 2-3 times, so that if at all the question comes in exam also you will be able to write. Okay, so first of all, what is foreign trade policy? Foreign trade policy refers to the set of guidelines which is given by the Directorate General of Foreign Trade. This Directorate General of Foreign Trade is an authority which is under Ministry of Commerce and Industry. Ministry of Commerce and Industry has been delegated with the power with respect to regulating the imports and encouraging the exports. So for regulating the imports and encouraging the exports, one law has been created, that is Foreign Trade Regulation and Development Act 1992. Under that Foreign Trade Regulation and Development Act, the job of regulating imports and encouraging exports is given to the Ministry of Commerce and Industry. So that Ministry of Commerce and Industry delegated that power to DGFT, Directorate General of Foreign Trade, and the DGFT will come out with a policy for the purpose of doing this. So that is called as foreign trade policy, and they will implement this foreign trade policy through their regional authorities who are located across the country. So that is about this foreign trade policy is about. Then what is the difference between foreign trade policy and Customs Act? Foreign trade policy talks about the brain of the international trade, what to import and what to export, whereas Customs Act talks about the procedures, valuation, authorization, how to import and how to export. So what to import, what to export is in FTP, how to import and how to export is in Customs Act. And this foreign trade policy, current foreign trade policy is with effect from 1/4/2023, and for current foreign trade policy there is no sunset clause, which means usually every foreign trade policy is for a period of 5 years, but the current foreign trade policy we don't have any end date. So till the time it is withdrawn or it is amended, so this foreign trade policy will be existing. So current FTP shall continue to be operation unless otherwise specified or amended. And so these provisions of foreign trade policies are governed under Foreign Trade Regulation and Development Act, and I told you, so it is controlled by DGFT and regional authorities. So basically, what are the contents of foreign trade policy? We have the basic policy plus export incentives. So what is the policy with respect to import of certain goods, whether it is prohibited, restricted, etc., and what are the various export incentives? Then we have handbook of procedures, which is not there in syllabus. So then that is what are the procedures to be followed. Then what are the forms and standard input output norms and harmonized system of coding, that is Indian trade classification. So for what product, what is the policy, etc. So this point number 2 to point number 5 is not there for us, only the basic policy and export incentives is applicable. In that, the basic aspects of FTP that we are trying to understand. So imports and exports are classified into 4 in case of FTP, that is prohibited, which means you cannot import that or you cannot export that. It's called as prohibited. Restricted means you can import it or export it, but you need a license to import or export. That license is called as authorization. And number 3, so that is called as reserved for ST, which means only state trading enterprises can import those goods or export those goods. For example, food products can be imported only by Food Corporation of India. Petrol and other fuel products can be imported by IOC or ONGC. That is called as reserved for state trading enterprises. And finally, freely importable and freely exportable, which means that you can import it or export it without any license. Not that freely importable means no need to pay duty. So here we don't bother about the custom duty, we are talking about the policy. So therefore, freely importable, freely exportable means you can import it or export it without any license. That is called as freely importable and exportable. And then authorization refers to the license. So generally, whenever the restricted goods are there, those restricted goods can be imported only under an authorization. So this authorization we need to obtain from Directorate General of Foreign Trade. This is like a license required, and either through DGFT or through regional authorities we will be getting. Authorization is not a right. When we make an application, if they are not granting, it does not mean it is a right and we should get it. And DGFT or regional authority may refuse to grant or renew, and license under old FTP continue to be valid in the new FTP also. And restricted goods imported are subject to actual user condition. Actual user means only the person who is importing should use those goods. He should not be transferring those goods to any other person. But DGFT is having power to dispense the condition. So which means they can allow these goods to be sold to any other person also. So actual user condition may be dispensed with. And every importer and exporter is required to obtain an import export code from DGFT, and that is a 10-digit permanent account number. Your permanent account number itself will be notified as the IEC, but we need to make application for that. And specific provision in FTP shall prevail over the general provisions that we know. And we have some trade facilitations under foreign trade policy. So these are the various trade facilitations that they have given, Indian government has given to the importers and exporters. So what are those trade facilitations? So now whenever you get a question, so write a brief note on trade facilitations under FTP. So any few points you remember and you need to write that. The first trade facilitation is they have appointed a National Committee on Trade Facilitation. So this is an interministerial body. So for the purpose of, like single point clearance with respect to all the formalities. So this interministerial body has been created, and they have 4 pillars. So transparency, technology, simplification of procedures, and risk-based assessment and infrastructure. So these are the 4 pillars of this National Committee on Trade Facilitation. So transparency, so all the procedures will be transparent and there are no hidden costs, etc. associated with this technology. Everything will be online. And simplification of procedures and risk-based assessment. So not that everyone will be assessed, only based on risk criteria. So the assessments needs to be done. That is that. Then free passage of export consignments. So whenever the goods are being taken for export, so generally we should not be putting much restriction on export, and unless there are doubts that these goods are hazardous or prohibited goods, they can do the examination. Consignments meant for export shall not be withheld or delayed for any reason by any agency of central or state government. In case of any doubt, authority may ask for an undertaking from exporter and release such consignment. No seizure of export related stock. That's what. No seizure has to disrupt the manufacturing activity, but in exceptional cases, so based on prima facie irregularities, they can seize for a maximum of 7 days unless irregularities are substantiated. So because export should not be restricted, so that's the reason why, so they have relaxed these conditions. Then they created something called as authorized economic operator program. So this authorized economic operator, so it is like they are partners in the nation building, so to enable the business involved in international trade to reap the benefits. What are the various benefits that are given to this authorized economic operator? So the government will notify certain exporters as authorized economic operators, so to them certain privileges are given. So you mark this as important. So what are the various benefits that are given to the authorized economic operator? Remember the keyword preferential bids. Preferential, so preferential bids, preferential bids. So this authorized economic operator will get a preferential bid. What is it preferential bid? First, preferential customs treatment in terms of reduced examination. So there won't be much examination. They will get a preferential treatment with respect to reduced examination and faster processing and clearance of cargo. Number 2, so not only in India, even at the time of export, so Indian government will have some agreement with the foreign countries. So with those countries where India is having some trade agreement, so there they get the border clearance privileges. So these exporters will get the border clearance privileges in mutual recognition agreement partner countries. That is B. E for enhanced port delivery. So even in the ports also, whatever benefits that they need, like all the people will be able to assess them. That is called as enhanced port delivery. And D is deferred payment of customs duty. In procedures, we have learned that deferred payment of customs duty, rather than paying customs duty immediately, we can pay customs duty at a frequent intervals. That is deferred payment of customs duty facility is also given to them. And finally, self-certification. Generally, they need to produce a country of origin certificate. So this country of origin certificate they need to get from Indian government, but with respect to that, self-certification they can do. Not only this, lot of documents they can do self-certification. So this is with respect to benefits given to them. So remember preferential bids. So these are the various benefits given to authorized economic operator. It can be asked as a short note question. Then other measures, so we have a single window system to facilitate export of perishable agricultural produce, because whenever the agricultural produce needs to be exported, there is only a small gestation time. So within that time, the agricultural produce needs to be exported. So therefore, in the form of formalities, it should not be delayed. So therefore, they have established a single window clearance. So that authority has given the clearance, which means that the goods agricultural produce can be exported. Niryat Bandhu. So this Niryat Bandhu is like mentoring the exporters. So they will be mentoring the new entrepreneurs who has started the business of exporting. So then issue of e-IEC. So now IEC is made online, and DGFT online customer portal is there. So 24/7 whatever queries we have, we can get it solved there. And online facility for e-registration cum membership certificate. RCMC refers to registration cum membership certificate. Generally, if you are an exporter, you need to get this membership certificate from the relevant export council. So for example, if you are an onion merchant exporter, so then there will be Onion Merchant Exporters Association will be there. In that association, you need to take a membership. Same way, if you are a gold merchant, so there will be Export House for Gold. So in that place, you need to get a membership. Otherwise, you will not get the benefits under foreign trade policy. That online facility for e-certificate of origin, I told you, generally in the other country we need to, that is exporter needs to produce the certificate of origin. So the importer will be asking us to get that. So that is now made online. Online facility to file quality control and trade disputes. So then bank realization certificate to prove that the export proceeds are realized. So we need to get a bank realization certificate, that also can be made available online. These are other measures. Then they have set up certain towns for export excellence. So like central government will be taking investment in the towns where there has export potential, even if the state government is not spending money in those towns, but the central government will be spending money for the purpose of enhancing the exports. So selected towns producing goods of 750 crores or more may be notified as town of export excellence. In case of handloom, handicrafts, agriculture and fishery sector, so that will be 150 crores. So common service providers in these areas shall be entitled for authorization, and other EPCG like various incentives also will be given to them. Then there is something called as status holder certification. So this status holder certification is again an important area. So depending upon the export performance, so they will be given a star status. So what is that export performance? So the star status will be like 1 star, 2 star, 3 star, 4 star and 5 star. To achieve the 1 star status, they should have a export performance of $3 million. And in case of 2 star, remember, so remember this 315 50 200 800. Okay, so what is it you need to remember? You need to remember one mobile number. What is that mobile number? 31550 31550 200 800. So $3 million 1 star, $15 million 2 star, $50 million 3 star, 200 and 800 4 star and 5 star. So this is the export performance. So and So basically the star status is to encourage the exporters by recognizing their achievement, and they will be eligible for certain benefits also. So what are the various benefits to the status holders? So you remember with a keyword wipes made in India exempted. So these are the various benefits to status holders. Wipes made in India exempted. W refers to warehouse. So a 2-star and above, except 1-star, 2-star and above can have their own warehouse. And then I for input output norms. Usually exporters so need to obtain input output norms for their industry, so then only they will get the license to import the restricted goods. So that input output norms will be fixed on priority within 60 days. And then we have P for preferential treatment and priority in handling, which is already there for the authorized economic operator. The same privilege is given to them. Then E for exports free of cost, except gems and gold jewelry. So there won't be any cost associated with respect to the exports. Then yes, self-declaration with respect to authorization and customs clearances. This we have already seen even for authorized economic operator. Then made in India. So made in India self-certification for 3-star and above. So 3-star and above can certify that these goods are made in India, and exempted from furnishing bank guarantee and compulsory negotiation of documents. So made in India exempted. So these are the benefits to status holders. You need to remember this. Wipes made in India exempted. W for warehousing license 2-star and above. Then I for input output norms on priority within 60 days. And P for preferential treatment and priority in handling. E for so exports free of cost, and S for self declaration with respect to authorization and custom clearances. Made in India certification for 3-star and above, and exempted from furnishing bank guarantee. What is this renegotiation of documents? So basically negotiation of documents means that so they need to go to the bank and they need to discount that bank guarantee or other things, so that they are exempted from doing. That is this. So how to compute the export performance? Usually this export performance we have $3 million, 15 and $50 million, etc. So this will be based on current and previous 3 financial years, but in case of gems and jewelry sector it will be current and previous 2 years, but otherwise it will be current and previous 3 years will be taken. So 4 years cumulative exports is only this $3 million, $15 million, and we need to achieve this in all the 3 preceding financial years. So then only for the 4th year we will be able to get, for example, last 3 years. So export performance we need to count. So and that export performance is 3 million, 15 million, depending upon that. In the 4th year they will be able to get. So means 3 times they need to achieve the $3 million. Only then 4th year they will be getting. That is the meaning of that. 3 times they need to achieve $3 million, then they will get 1-star. 3 times they need to achieve $15 million, then they will get 2-star. And in case of gems and jewelry sector, it will be 2 preceding years. Then grant of double weightage, that is if they are making 100 rupees as export, so it will be counted as 200 in case of MSMEs. So micro, small and medium enterprises, manufacturing units having ISO or BIS certification, or northeastern states, unit in northeastern states, Sikkim, Jammu and Kashmir and Ladakh, and exports of fruits and vegetables, only till the time they are achieving the 1-star status, they will be given this double weightage. And then so these are the 2 areas which are very, very important. If you see what are the benefits to authorized economic operators and what are the benefits to status holders, and when they will be called as status holders. So these benefits to status holders already they have given in RTP May 24. So due to that reason there is a chance of asking this question as a theory question. Then next specific provision relating to import and export. Here you should be making it very simple. What is that? Suppose if it is restricted, it is requiring authorization. If it is freely importable, it do not require authorization. Freely importable, freely exportable do not require authorization. Restricted means it requires authorization. This is the general provision. Whereas wherever there is a deviation, even though it is freely importable, but it requires authorization. Even though it is restricted, but do not require authorization. So this is where you need to remember. Exceptions you need to remember. The general provisions you don't have to make any remembrance related to this. For example, you are importing or exporting samples. Say you are importing samples, and import of defense items, seeds, bees and new drugs. We don't know whether it is generally freely importable or freely exportable, but you are importing it as a samples, so that requires authorization. Then other goods freely importable even if they are restricted. So generally those goods are restricted, but when you are importing it as samples, you don't need any license. But with respect to 4 goods, always license is required. What are they? Defense items, seeds, bees and drugs. So requires authorization. Then whenever you are exporting some goods, those goods are generally restricted goods. It requires authorization. Those goods are freely exportable goods that do not require authorization. So this you don't have to remember. So this is based on the general provisions. So this, whatever is there, this is general. This is general. So there is nothing to remember. But this part is there, na, import part. So that import part you need to remember. So what is that you need to remember in this import part? Generally goods are freely importable or restricted, you leave it. But when you are importing samples, okay, let it be freely importable or restricted. For goods as import as samples, you always need authorization. What are they? So that is defense items, seeds, bees and new drugs that requires authorization. Other goods not require authorization. So don't see what is the type of goods, whether it is generally restricted goods or freely importable goods, that is not required. Then up to what extent we can bring the samples without payment of customs duty? Up to 3 lakhs we can import the samples without payment of customs duty. Okay, then that is this duty free import of samples up to 3 lakhs without payment of customs duty. So this also you need to remember. So you just put a tick, and that only we need to remember more. Then import or export of gifts. So first we will see import of gifts. With respect to import of gifts, so if, like, again, don't see what is the type of the product, whether it is freely importable product or restricted product, you don't see. You are getting something as a gift. Suppose if it is through post or courier, including e-commerce, only few goods can be coming as gifts. Other goods should not come as gifts in post or courier or e-commerce. So only 2 goods, that is Rakhi and life-saving medicines, can only come through post or courier as gift. Other goods should not come as a gift. If it is coming as gift, it will be prohibited. They will not allow you to do the clearances. So they will retain that goods. Okay. So but Rakhi life-saving medicines, you can bring it as post or courier as gift and do not require any authorization. Does not require any authorization. And customs duty payable on gifts imported. Of course, we have to pay the customs duty. Only thing, it do not require authorization. See, it may be originally restricted or originally freely importable, that is irrelevant. You are getting some goods as gift. First, in which mode it is coming as? So post or courier or e-commerce. Only Rakhi and life-saving medicines, this is allowed. Do not require authorization. All other goods prohibited. And even though it do not require authorization, but customs duty you need to pay. But for customs duty also they have given a relaxation. If the customs duty is up to 100 rupees on Rakhi, that is exempted. We don't have to pay the customs duty. Whereas if you are importing to other modes, authorization not required, even though those goods are restricted goods, because you don't know whether it is a restricted product or not when they are sending. So that do not require authorization, but it should be coming through other modes. Other modes means what? So like a commercial regular cargo, it should be coming, it should not come as courier or post. So this you need to remember. Then when it comes to export of gifts, simple. So if the product is restricted, definitely that requires authorization, general. If the product is freely exportable, that do not require authorization, normal, that is general. But even though it is freely exportable, but if the value of goods exceeds 5 lakhs, so then that requires authorization, because freely exportable only do not require authorization. But why you are exporting it as gifts more than 5 lakhs? So the foreign exchange will get affected. So therefore that requires authorization. That is the exception. Remaining is general point, you don't have to remember. So then next one, passenger baggage. Passenger baggage, so it is fully based on the general provision only. We don't have to remember. If it is restricted goods, that requires authorization. Freely importable goods, authorization not required. Restricted goods, authorization required. Freely exportable goods, authorization not required. But what you need to remember is, even though it is restricted goods, okay, even though it is restricted goods, but if it is household goods and personal effects, drawings, patterns, designs and other notified goods, then do not require authorization. That alone you need to remember. So baggage, general rule. So if it is restricted goods brought as baggage, requires authorization. If freely importable goods brought as baggage, do not require authorization. Same way at the time of export also. But we have one exception. That exception you need to remember. What is that? Generally these goods are restricted goods, but the restricted goods is household goods and personal effects, drawings, patterns and other notified goods for export in baggage. So that do not require authorization. Then import of second hand goods. So you are importing some second hand goods. What are those second hand goods? If it is capital goods or other than capital goods. See, capital goods, even though first hand when it is imported, it requires license or do not require license, that is irrelevant. But we have a separate provision related to import of second hand capital goods. What is that? So you are importing some second hand capital goods. So it's first hand, don't bother. Now, what are those second hand capital goods? If it is air conditioners, generator sets, AC, generator, desktop, refurbished or reconditioned spares of laptops or notified electronic goods. Okay, now they have changed the list. So air conditioners, generator sets, desktop, refurbished or reconditioned parts of laptops or desktops and notified electronic items require authorization. Even though it's first time, do not require authorization. Other capital goods, so do not require authorization. But they have given, if it is reconditioned spares, reconditioned or refurbished spares, so at least 80% of the original life should be there for this reconditioned or refurbished spares, because in the name of waste, like reconditioned spares, waste and scrap should not be imported into India. That's why they are telling at least 80% of the original life of the spare should be there. So only 2 points. These goods requires authorization, other goods do not require authorization. Other than capital goods, that is remaining goods. Remaining goods, so requires authorization definitely. So then what about if it is import for the purpose of repairs or refurbishing or reconditioning? Authorization not required. Again, we don't have to follow what is the regular policy when it is imported in first hand. So for second hand, entirely you need to remember the separate provisions with respect to this. Also one more point, if the capital goods are used in a project abroad for at least 1 year, so that can be imported into India without any license, any goods. Even these goods, ACs, generator sets, etc. So if it is used in a project abroad for 1 year, so we don't have to execute any license. Without authorization, it can be imported even if that goods are otherwise restricted. Then prototypes. Prototypes means what? Prototypes means generally it is like a product which is developed. So a specimen of the product or a model of that product. So new or second hand prototypes or second hand samples may be imported without an authorization. So we don't need any authorization. Okay. So provided that it is under actual user condition and the person who is importing is engaged in production or having an industrial license, and he files a self declaration that he is not going to sell it, but it is just a prototype. Okay, so that do not require an authorization. Then metallic waste and scrap always requires authorization, because that is harmful for the environment. So import of any form of metallic waste scrap will be subject to the condition that it will not contain hazardous, toxic waste, radioactive. So it is conditioned that, suppose if it contains hazardous, toxic waste or radioactive contaminated waste and scrap, then in that case it is prohibited. It is prohibited. So other waste and scrap is allowed. So if waste and scrap contains hazardous, toxic waste or radioactive contaminated waste or scrap containing radioactive material or types of arms, ammunition, shells, etc., so then it is prohibited. Remaining waste and scrap is allowed, but that requires authorization. So waste and scrap always require authorization. Always require authorization. Then next, import for export. So this is general, import for export. If it is freely exportable, do not require authorization. Restricted for export, requires authorization. Okay, so restricted, generally freely exportable. First it is freely importable, yeah, then it is freely exportable. On import, authorization not required. On export also authorization not required. Okay, then so freely importable and restricted for export. So freely importable, so authorization not required for import if exported in the same or substantially same form. For export also we don't require any authorization if it is exported in the same or substantially same form. So what you need to remember, if it is freely importable and it is exported, whether at the time of export the restriction is there or not, don't bother. If the imported goods are exported in the same or substantially same form, you don't need authorization. Then next one, restricted for import. At the time of import it is restricted, definitely authorization required. Simple. So it is general. So only this point you need to remember, and this is general. Why it is general? Suppose if it is freely imported, restricted for import. Once it is restricted for import, definitely authorization is required for import. Restricted for import and export, authorization required for import and export also. Then next one, you are importing some goods or you are locally purchasing some goods and you are exporting it for repairs or quality improvement or upgradation. So if it is restricted goods require authorization, freely importable goods authorization not required. So that's a general rule, you don't have to remember that. So these are the points. So whichever points I have marked as tick, that alone you remember. And then finally we have export promotion schemes. So the various export promotion schemes or export incentives that we have is first advance authorization and duty free import authorization. And let's see what is the purpose of this. This is basically for the purpose of procurement of goods, that is raw material, without payment of customs duty. That is why we have advance authorization, duty free import authorization. That is, you are an exporter, you can procure the raw material without payment of customs duty. Then next we have something called as EPCG. So this RODTEP is there, then EPCG, like how AA and DFIA is for import of raw material or procurement of raw material without payment of customs duty. EPCG is for procurement of capital goods without payment of customs duty. And then suppose if you have some local taxes, so to give you the relief of the local taxes, that refund of the local taxes, they have created a scheme called as RODTEP scheme, rebate of duties and taxes on exported goods scheme. And thereafter we are having export promotion zone schemes, that is EOU, EHTP, STP and BTP. What are the various incentives available to them? And finally deemed exports. So deemed exports means there are some goods and which are sold to some people in India, but it will be considered as exports for the purpose of FTP, and we are eligible for certain incentives. So let's try to understand first what are the various deemed exports that we have. So the objective of deemed exports is that Indian manufacturers are treated on par with the foreign suppliers to promote the Make in India initiative. That is, rather than say you are an exporter, rather than you are purchasing from a person outside India, you purchase from me. So therefore you will be saving the foreign exchange outflow. When you save the foreign exchange outflow, it is equal to earning the foreign exchange. So the theory is simple: foreign exchange saved is foreign exchange earned, and the consideration, so for me either the consideration can be in Indian rupees or it can be in foreign currency, so that is okay. So basically you are importing, rather than you importing, you purchase from me. For me it is considered as deemed export. So what are the various deemed exports under foreign trade policy? First, so you are an advance authorization holder, means you are an exporter, you can import the goods without payment of custom duty. Rather than importing without payment of custom duty, you can purchase from me without payment of GST. For me it is deemed export. This is already in GST. Number 2, supply of goods to EOU, EHTP, STP and BTP. Say you are EOU, EHTP, STP and BTP, you can import goods without payment of custom duty. Rather than importing, you can procure from me without payment of GST. So that's why for me it is treated as deemed exports. And then EPCG. So you are a EPCG holder, means you can import the capital goods without payment of custom duty. Rather than importing the capital goods, you purchase from me without payment of GST. So these three are treated as even deemed exports under GST. So that is sale to AA, sale to EPCG holder, or sale to EOU, EHTP, STP and BTP. And then there are some projects which are called as projects, international competitive bidding projects, or project financed by international competitive bidding. So notified projects financed by agencies notified by Department of Economic Affairs, and international competitive bidding projects. So total 5 projects you need to remember. So any projects which are international competitive bidding projects, which means a bid can be placed by any person across the globe. So international competitive bidding project, or the projects which are financed by Ministry of Department of Economic Affairs. And then mega power projects, nuclear projects, or projects financed by UN or international organizations. So to them if you are making supply, that is also called as deemed exports. So suppose if I am making supplies to these people, for me it is called as deemed exports. What are the various incentives or benefits in case of deemed export? Number 1, for making the sale I can import without payment of customs duty under advance authorization, or for making the sale I can import the goods whenever I am selling to these people, whatever customs duty I paid on import I will get as a duty drawback. These are the 2 incentives. So advance authorization, so I can import the goods to make sale to these people without payment of customs duty, or I can import the goods on payment of custom duty, then I can sell it to them and I will get the duty drawback. Even refund of terminal excise duty. Suppose locally if I procure anything to make the goods, on that locally procurement if there is any excise duty burden, that also will be refunded to me. So that is the benefits in case of deemed exports. And conditions for deemed exports: supply shall be made directly to the entities listed above. Third party supply shall not be on their behalf, that is on these people's behalf. If I am making supplies to some other person, that will not be counted as deemed exports. In all cases, supply shall be made directly to the designated projects or agencies, and subcontractors may however make supplies to the main contractor instead of supplying directly. Say for example, I am the main contractor and I am appointing one subcontractor. Subcontractor can make supply to me. For subcontractor also it will be treated as deemed exports. And supply of domestically manufactured goods by Indian subcontractor or to any Indian or foreign main contractor directly at the designated project shall also be eligible for deemed export benefit. Either they can supply to me or they can supply directly to the site. So then also for them, the subcontractor, it will be treated as deemed exports. So these are the various deemed exports and the benefits in case of deemed exports. Now if you see advance authorization and duty free import authorization. For what purpose? These two licenses are for the purpose of procurement of goods, import of goods without payment of custom duty, or local procurement without payment of GST. And why we have two licenses? So if you see, first point, advance authorization, whatever license that we have got, it is non-transferable, means only the person who is having the license can import the goods, whereas DFIA is transferable after they complete the export obligation. Export obligation means when you are getting a benefit, you also have an obligation to achieve the exports. So both these licenses have an export obligation. So but in case of AA, even after export obligation gets completed, you cannot transfer the license to some other person, but DFIA, duty free import authorization license, can be transferred. Outward supply, under advance authorization, you can make physical export. So including supplies to SEZ will also counted for export obligation, deemed export also counted for export obligation, and sale to foreign going vessel or aircraft is also counted for export obligation. Whereas in case of DFIA, only physical export is considered for export obligation. How much should be the export obligation under AA? So minimum value addition 15%, which means if your import CIF value is 1 lakh, your FOB value of export should be more than or equals to 1,15,000. So minimum value addition 15%. However, in case of specified goods, it can be less than 15%. Whereas under DFIA, the minimum value addition is 20%. Means if the CIF value of import is 1 lakh, the FOB value of export should be 1,20,000 or more than 1,20,000. Then eligibility. Who is eligible for advance authorization? An exporter who holds a AEO, authorized economic operator certificate, or 2-star and above status. They both only are eligible for AA, but all other exporters are not eligible for AA. So who are eligible for AA? Authorized economic operator or status holder 2-star and above. Okay, then all other exporters not eligible for AA, they will get only DFIA. And fixation of standard input output norms. AA can be issued even if SION is not fixed, but DFIA will be issued only if SION is fixed. So then duties that are exempted. So basically in case of advance authorization, all the duties are exempted, including the CVD, SAD, IGST and additional customs duties, everything is exempted. But in case of DFIA, only basic customs duty is exempted, but other things we need to pay. But of course, IGST we can take as ITC. And applicability of authorization. So in case of AA, only manufacturer exporter or merchant exporter tied to supporting manufacturer, they only will be getting the benefit. So merchant exporter means the one who is exporting, supporting manufacturer means the one who manufactures. Okay. Whereas in case of DFIA, a merchant exporter, even though not tied to supporting manufacturer, is eligible for DFIA benefit. So when available, so in the case of AA, imported inputs are subject to pre-import condition. Pre-import condition means first you import and you will not be paying any customs duty, then you use it in the export and you need to make the export. Whereas DFIA is like post-export basis. Post-export basis means first you import with payment of duty, you export it, based on export, next time you can import without payment of customs duty. That is basic customs duty. When is it not available? So AA is not available for specified export goods as well as specified inputs. Whereas in case of DFIA, no DFIA shall be issued for an input which is subject to pre-import condition, because for pre-import condition we have only AA. And then import of tires also not eligible for DFIA. And finally, what is the validity? So in case of AA, if you are making deemed exports, the validity is 12 months or the project completion, whichever is later. In other cases, 12 months from the date of issue, and revalidation for further 12 months only once. So 12 months plus 12 months, but DFIA only for 12 months and there is no further revalidation, means within this period we need to import. And export obligation period, in case of AA we need to achieve 15% value addition, DFIA 20%. AA we need to achieve within 90 days from the date of clearance of import consignment, whereas DFIA we have enough time, 12 months from the date of online filing. Then we have something called as advance authorization for annual requirement. So like yearly this much amount you can import, this much value of the goods you can import, like that they have given how much entitlement. So you can import up to CIF value of imports of 300% of FOB value of physical export, or in the preceding previous year, or 1 crore, whichever is higher. So last year export is somewhere like 2 crores. So 2 crores into 300%. So that is like 6 crores or 1 crore, whichever is higher. So 6 crores worth of raw material you can import it without any payment of customs duty. That is known as advance authorization for annual requirement. This will be given to any person. So this will not be given only to authorized economic operator or to 2-star and above status holders. This will be given for all exporters who is having a past export performance in at least preceding 2 financial years. So they are eligible for this. Okay. And what is that export performance? So that is what we have seen. So they should be having some exports, they will be eligible for advance authorization for annual requirement. And fulfillment of export obligation, basically the value addition is based on FOB value of exports minus CAF value of imports divided by CAF value of imports into 100. So that should be taken. If any free of cost material is supplied by the importer to the exporter, which is used in the imported goods, so then in that case, so that particular material should be added to both exports and imports. And then we have RODTEP scheme. So rebate of duties and taxes on exported goods. This scheme is very simple. So in order to give the relief against the local taxes which are borne on the exported goods, so there will be this RODTEP scheme. There are various local taxes like corporation tax, municipal tax, mandi tax, local body tax, garbage tax, etc. These taxes will not be having any refund. In case of GST, there is a refund on export. In case of customs also there is incentive. But there are no incentives in these local taxes. To give the benefit of these local taxes, a percentage of FOB value of your exports will be given as an incentive. That will be given in the form of e-scrip, and that e-scrip amount can be used only for payment of customs duty, or if you don't have like the customs duty liability, you can transfer that to any other person. That is known as transfer of credit scrip. And this transfer of credit scrip will be treated as exempted for purpose of GST, but for availment of ITC it will be treated as taxable. So, and the rebate under this scheme is not available in respect of duties and taxes already exempted or remitted. So it will be given as a percentage of FOB, that will be given in the question itself. And this rebate is subject to condition that you need to realize the proceeds within the time limit under FEMA, that is 9 months. Not that the rebate will be given only after 9 months. First the rebate will be given, but you should ensure that you are realizing the proceeds within 9 months. And there are some ineligible supplies or categories. So in this case, RODTEP scheme not possible. Number one, export of imported goods. First of all, there is no local taxes on this. You are importing from one country and exporting to other country, there are no local taxes. And exports through transshipment, same. You are importing from one country and exporting to other country, so there is no local taxes on these goods. Export of goods subject to minimum export price fixed by the government. So you are exporting at the price fixed by government, so there is no element of local taxes in this. So restricted goods and prohibited goods, you will not get RODTEP. Deemed exports also you will not get. And supply of products manufactured by DTA units to SEZ. So whenever we are making sale to SEZ also, there is no RODTEP, that will not be counted. Deemed exports also not counted for RODTEP. Products manufactured by 100% EOU. First of all, there is no local taxes for goods manufactured in 100% EOU. Even goods which are exported under the discharge of value addition under AA DFIA. For AA DFIA, we will make some exports. Now that will not be counted for RODTEP purpose. So this you need to remember. These are some ineligible cases where you will not get RODTEP benefit. And next we have EPCG scheme. So in this EPCG scheme, what we will do, we will be importing the goods without payment of the capital goods, without payment of customs duty. So but we have a export obligation, and import of goods, capital goods, even without payment of GST, IGST or GST compensation cess. So who are eligible? Manufacturer exporter with or without supporting manufacturers, merchant exporters who are tied to supporting manufacturers, and service providers, so designated as common service providers. All these three people are eligible. And meaning of capital goods, any machinery, equipment, apparatus can be imported. So either the capital goods can be procured from the global market or from the local market, that can be used for any operations, either manufacture, mining or agriculture, etc. And even restricted goods can be imported, but definitely we require approval, and it can be imported in semi knockdown or completely knockdown condition. And even computer systems also can be imported, molds and dies also can be imported. But all these capital goods which are imported are under actual user condition till the export obligation is completed. After the export obligation is completed, goods can be sold or transferred. How much is the export obligation? Basically, we have two types of export obligation under EPCG, that is specific export obligation and average export obligation. What is the average export obligation? We need to maintain every year exports as the average of the 3 preceding years, and beyond that, if we are making any export, that will be counted towards specific export obligation. How much is the achievement that we need to make? 6 times the duty saved on capital goods. For example, duty saved on capital goods is 100 lakhs, 100 lakhs into 6 times 600 lakhs, but this 600 lakhs is over and above the average export obligation. So export obligation means obligation to export products covered by authorization in terms of quantity or value or both, as may be prescribed or specified by regional or competent authority. Export obligation consists of two: specific export obligation and average export obligation. Specific export obligation is over and above the average export obligation. So what we need to do, first we need to achieve the average export obligation. Excess amount will be taken towards the specific export obligation. So specific export obligation is 6 times the duty saved on capital goods. So that is in case of direct import, actual duty saved. In case of domestic sourcing, so the notional customs duty saved on FOR value. Average export obligation is average of the 3 preceding licensing years. It should be achieved within the overall export obligation period. What is the validity of authorization? Once the license is given, the license is valid for 24 months, means in this 24 months we can import the capital goods. And we have some special points with respect to export obligation. The average export obligation shall be fulfilled every financial year till the export obligation is completed, and over and above AEO will only consider for export obligation, specific export obligation, and either it can be through export of goods, either he manufactures or manufactured by the supporting manufacturer, even some export of services or exports through third parties also can be considered. And in case of local procurement of capital goods, we don't have to achieve 6 times, we have to achieve 4.5 times, and there is no change in average export obligation. Export under advance authorization, everything, so wherever under advance authorization, then duty free import authorization also you need to achieve some value addition, that will also be counted for export obligation here. Exports made from DTA shall only be counted for calculation after fulfillment after fulfillment of AEO, and export obligation can be fulfilled by supply of information technology agreement items, and both physical exports as well as deemed exports, both will be considered for export obligation. So they have given lot of relaxations to achieve the export obligation. And then we have export promotion zone schemes. So basically these are about EOU, EHTP, STP, BTP units, and objective is so to promote the exports. All kind of businesses they can do other than trading units, and majorly export of goods or service other than prohibited, and they should not be making sales to DTA except the permissible limit, and they need to get a approval from the unit approval committee or board of approval, and once they get the approval it will be valid for a period of 5 years, and thereafter it can be extended for a further period of 5 years by the development commissioner. What are the tax implications? Any goods imported by them is exempted from payment of custom duty including IGST, but on import of services they need to pay GST under RCM, and whenever they locally procure, that is eligible for deemed exports to the supplier. So supplier is having two options, they will not recover any GST or they can recover the GST, and the EOU can claim the refund. Whenever they make supplies to the recipient, that will be chargeable to normal GST. Export of goods or services is exempted from payment of customs duty. So these are the various incentives. And then other entitlements, they are exempted from industrial licensing, and even export proceeds will be realized in 9 months, and units will be allowed to retain 100% of its export earnings through EEFC, exchange earners foreign currency account, and they will not be required to furnish bank guarantee, and 100% FDI permitted through automatic route. So these are some important points you need to remember. Then inter-unit transfer, they can transfer from one unit to another unit on payment of applicable GST. So whatever is there. Then who can establish? Any person who is having minimum investment of 1 crore in plant and machinery can establish in EOU, but board of approval can allow with lower investment criteria. Even existing DTA can be converted into EOU, and they need to achieve a positive net foreign exchange earnings, that is income in forex minus expenditure in forex should be positive in that period of 5 years, otherwise the next 5 years they will not be getting the extension, and whenever they want to exit from the scheme, they can exit from the scheme, but subject to payment of applicable customs duties and GST. So then if they have not achieved any obligations, they are liable to pay the penalty at the time of exit. So then whenever there are certain benefits with the conditions, if you are not fulfilling those conditions, then that entity will be called as denied entity. So in the following situations, a person shall be liable to penal action. So that is, authorization holder violates any condition or fails to fulfill export obligation or fails to deposit the requisite period amount within the period specified, and any information or particulars furnished by the applicant is subsequently found to be untrue or incorrect, in that case they will be called as denied entity list. And so once they breach this, so their name will be kept under the denied entity list for a period. So then in that case the firm may be refused to grant renewal of any license or authorization. All new licenses will be blocked. The firm name can be removed by concerned regional authority if the firm completes export obligation or pay the appropriate penalty. So these are the various points that we have with respect to foreign trade policy. With this we completed.
Let's move on to the further discussion, which is CMA extra topics. There are 2 extra topics exclusively for CMA final, which is not there into the discussion so far what we have made in CA final rocket division, that is duty drawback and SEZ provisions. So let's have a look into this duty drawback chapter. So first, what is this duty drawback all about? There is an exporter. That particular exporter is importing some goods, and on those goods, so he has paid some customs duty. Now those goods are being exported. When the goods are being exported, on import, whatever customs duty is paid, a percentage of the customs duty paid on import will be given as a refund, and that refund is only known as duty drawback. So basically, what is duty drawback? Refund of customs duty. Okay, so duty drawback in simple words is nothing but refund. Duty drawback is nothing but refund. Okay, so refund, when we will get this refund? There are total 3 situations where we will be getting refund. So this refund is paid under which law? Under customs law. Okay, so duty drawback is nothing but the refund. And when this refund will be given? In 3 situations the refund will be given. When is that? So we have imported some goods, and these imported goods are exported. So when it is exported, so either as such without use. So just remember this example. You are importing a robot. Okay, you are importing a robot for display in the exhibition, and that you have imported from Japan. And after completion of the exhibition, you are exporting it back to Japan. At the time of import, you paid some customs duty on that robot. So that when you are exporting, you will be getting the refund. So as such, whatever is imported, the same is exported without use. Okay, so robot in exhibition. Okay, so that you remember as an example. So what is the example for this? 74 subsection 1. The example for this is robot imported for exhibition. So robot which is imported, robot imported for exhibition, robot imported for exhibition. So that is an example 1. Situation 1, imported goods are exported as such without use. In this case, the duty drawback will be given under section 74 subsection 1. 74 subsection 2 is what? So I am importing the goods and I am exporting it as such after use. What does it mean? For example, we are importing racing cars. Okay, so example for this is racing cars imported. Racing cars imported. So we are importing some racing cars and we are conducting the racing in India. After the race is being conducted, so the car is being exported. Okay, so in this case also, imported goods and exported goods are same, but it is exported after use. But in the previous example, we have not used it. We have just displayed in the exhibition and it is exported. So that's the difference between 74 subsection 1 and 74 subsection 2. So what's the difference? 74 subsection 1, imported goods are exported as such without use. 74 subsection 2, imported goods are exported as such after use. Then 75. So 75 is imported goods used in manufacture of finished goods which are then exported. Okay, so I am importing some like raw material, and using the raw material I made the finished product. For example, I am importing the display panels, and I am importing the storage devices, and I am making using that so some iPhones or some other mobile phone, smartphones, and I am exporting it. Okay, so import of raw material for what purpose? To manufacture the finished goods, and which are then exported. So example for this is import of parts and export of smartphones. Okay, import of parts and export of smartphones. So which means whatever we have imported and what we have exported is not same. So imported goods are different from the exported goods. So we are basically doing some process or manufacture. So then we will be getting the benefit under section 75. So what are the 3 situations? Imported goods are exported as such without use. Imported goods are exported as such after use. Imported goods are used in manufacture of finished goods which are then exported. So we have 3 sections: 74 subsection 1, 2 and 75. Now we need to understand here, whenever we are getting the duty drawback, so already we would have claimed some benefit called as input tax credit. So what is the connection between input tax credit and duty drawback? Simple. You are importing some goods. On import, what are the customs duties that we pay? Basic customs duty we pay. Social welfare surcharge we pay. Even we pay something called as IGST. So that IGST which is paid can be taken as input tax credit. So let's go back to the first example. I am importing some robot. When I am importing the robot, on import of robot, I pay the basic customs duty, social welfare surcharge and IGST. That IGST I would have taken as credit. And at the time of export, I will get the refund. So then already I have taken the credit. Refund means it's a double benefit now. So due to that reason, either you claim the input tax credit benefit or duty drawback benefit. If you are claiming duty drawback benefit, you should not take ITC. That is this. But this is only in case of section 74, not in case of section 75. So only for the sake of 74, they have given this particular condition. So why? Why for 74 only they have given this condition? Why not for 75? Simple reason. To know that we need to see the rate of duty drawback, how much duty drawback we will be getting. If you look into the rate of duty drawback, in case of 74, subsection 1, 98% of the customs duty paid on import. So total customs duties, whatever we have paid, total including IGST, in that 98% we will be getting as refund. In case of 74 subsection 2 also, total customs duty, a percentage, so that notified rates we have, so that percentage we will get as a refund. So in this case of 74, we get the refund of total customs duty including IGST. But in case of 75, we will not get like that. So based on the export value FOB, a percentage we will get as a refund, duty drawback. Okay. So that will not cover our IGST. So as IGST is not covered, so in case of 75, that's why in case of 75, we can take the input tax credit. Okay. So in case of section 74, duty drawback covers IGST and GST compensations as paid on import. Therefore, ITC cannot be availed with respect to the same. However, in case of section 75, duty drawback covers only customs duty, but not IGST and GST compensations. So the ITC can be availed with respect to the same, and we can claim the refund of ITC. So that we have seen in GST refunds. So whenever we are exporting the goods, so then whatever ITC that is there, that we can get as a refund, net ITC into zero rated turnover divided by adjusted total turnover. So there we will be able to get the refund. So remember, whenever you are claiming duty drawback under section 74, you should not take ITC on the imported articles. Whereas in case of 75, when you are claiming duty drawback, you can claim the ITC with respect to IGST paid on the imported articles. So this is the difference you need to remember. Then next, so when is it admissible? 74 and 75. 74 already we discussed when 74 is applicable. If the imported goods are exported, either as it is or after use, and the imported article and the export article should be same or different. It should be the same article, is easily identifiable to the satisfaction of the ACDC of customs. Whereas in case of 75, imported goods are used in manufacture of finished goods which are then exported. So first we will complete the discussion related to 74, and then when we are discussing 75, we can make the parallel references as to identify the differences. Okay. So first we will complete 74 discussion. So what is the time limit? So the time limit, the goods must have been exported within 2 years from the date of payment of import duty, and it can be extended for a further period as approved by CBIC. So from the date we are importing or from the date we are paying the customs duty? From the date we are paying the customs duty. So whenever the goods are imported, those goods may be deposited in warehouse without payment of customs duty, and thereafter, so from the warehouse we can clear on payment of duty. So the time when we pay the duty, from there the export should be within 2 years. So what is the meaning of export? Export means the date on which we got the let export order. So remember, from the time we paid the customs duty on import till the time we are exporting, that is let export order, the time period should be 2 years, and it can be extended for a further period. So that's what I have given in the footnote. What is the meaning of export? Export goods shall be deemed to be entered for export on the date of let export order. Let export order is a order given by the customs officer whenever the goods are ready for export or permitted for export. Okay. Then next see the rates. So just now we have looked into the rates. So what is the rate in case of 74 subsection 1? Whatever custom duty paid. So for example, you are importing some goods on which the custom duty is 1 lakh. Now you are exporting those goods as such without use. Then how much we will get as duty drawback? 98% of 1 lakh. That is 98,000 we will get as a refund. So the loss here is 2%. And suppose if it is 74 subsection 2. In 74 subsection 2, what is happening? We are using it and later on we are exporting now. So because of that, depending upon the period for which we have used, a percentage will be reduced. Okay, so that we will see. So below this table you can see the rates. So duty drawback rates in case of 74 subsection 2. So 74 subsection 2 divided into two situations. What is that? Suppose if you are importing motor vehicles, so any person, it can be individual or company or partnership firm or any person, in case of import of motor vehicles by any person and goods imported by an individual for his personal and private use. So two scenarios, like, okay, they have given in the first chart, first branch, two situations. What is that? First, if you are importing motor vehicles, any person, or if you are an individual and importing some goods for personal purpose, then you have to follow this chart. Okay, what is it they are telling? Out of the customs duty paid, like a depreciation, they will be giving a percentage deduction and remaining amount you can claim as duty drawback. How much is that percentage deduction? So 4%, remember 4, 3, 2.5, 2. 4, 3, 2.52. Remember this? 4, 3, 2.5 and 2%. 4, 3, 2.5 and 2. For every quarter or part thereof in the first year. For every quarter or part thereof in the first year. Okay. For example, you are using it for 3 years. Let's take you are using it for 3 years and thereafter you are exporting it. So first year you are using now. So you are using it for the first year. 4% for every quarter means 4% into 4 quarters, 16% for the first year. Second year, 3% for every quarter. So 4 quarters into 3%, that will be 12%. And then 2.5 for every quarter part thereof in the third year. So 2.5 into 4, that will be 10. So total 38% will be reduced. So again I am repeating, 4% for each quarter in the first year. So 4 quarters into 4%, 16. And thereafter, so 3%, so 12. Okay, and thereafter 2.5. So 2.5 into 4, that will be 10. So total 38%. So 100 minus 38. So what is 100 minus 38? 62% you will be getting as a refund. So means 1 lakh you are paying means on import. So minus 38%. So remaining 62,000 you will get as a refund if you are using it for 3 years. Sir, whether this quarter should be calendar quarter or it should be taken as, so 3 months taken as 1 quarter. So it should not be calendar quarter. We need to count it from the date we are paying customs duty till the date we are exporting. That should be taken as a number of quarters. Okay. For example, so we are paying customs duty. We are paying customs duty on import on 5th of May 2023 and we are exporting it. We are exporting it on so 8th of November 2024. So now in this case, how we will count? How we will count the number of quarters or part thereof? Simple. 5/5/2023 to 5/5/2024, 1 year. 5/5/2023 to 5/5/2024, 1 year. And again, next we have 5/5/2024. So 5th May, June, July, August till 5th August. So 1 quarter. Then again, so August, September, October, 2nd quarter and 5th October over. So remaining 3 days. So therefore total 1 year plus 3 quarters. So again I am repeating, 5/5/2023 to 5/5/2024, 1 year. That's the first year. For that 4 into 4, 16%. In the second year, how second year? 5/5/2024 to 8/11/2024. How many quarters in this? So you take 3 months as 1 quarter. So 3 months as 1 quarter means 5/5/2024 to May to June, June to July, July to August. August is 3 months. So that is 1 quarter. Then again August, September, September to October, October to November. Again second. But in November only 5th November is the second quarter. So therefore remaining few days is there, that count as third quarter. So in the first year 1 full year, Second year 3 quarters. So for one full year means 4 into 4 16%. Second year 3 quarters means 3 quarters into 3%. So that will be 9%. So that's how we need to count. So we need to count it from the date on which we paid the customs duty till the time we are making the let export order. So everywhere in GST and customs, we need to take calendar quarter. But only in this duty drawback chapter, we should not take calendar quarter. We should count based on the days, months. So 3 months counted as 1 quarter here. Okay. So remember what is the percentage? So deduction from the customs duty paid, 4% for every quarter or part thereof in the first year, 3% for every quarter or part thereof in the second year, and 2.5% for every quarter or part thereof in the third year, and 2% for every quarter or part thereof in the fourth year. So this is how you need to reduce. So once you are reducing this particular percentages, so the remaining amount we will get as a duty drawback. And here if you observe, already the time permitted is only 2 years now, but here we are exceeding 2 years, because of which that extension is possible only if approved by CBIC, where such motor vehicles and goods imported for personal use are exported after expiry of 2 years. What is the logic of this 2 years? If you observe here in the previous time limit, the goods should have been exported within 2 years from the date of payment of customs duty na. So therefore after 2 years, then it will be allowed only if CBIC extends. No duty drawback shall be allowed if those goods have been used for more than 2 years. Okay. Then next one. So here what we have is other cases, all other cases. So when this will be applicable? This will be applicable in case of motor vehicles imported by any person or goods imported by an individual for personal purpose. Other cases means what? Goods imported by other than individual or goods imported by individual not for personal purpose, then it will be others. So when these others will be applicable? So first, goods imported by other than individual. Goods imported by other than individual, not motor vehicles, other goods. Okay, other than individual, this is one. And second one is, so goods imported by individual for other than personal purpose. Goods imported by individual, other than personal purpose, other than for personal purpose, then in that case, so we will be having the second branch. So here what they are telling, simple. So they are directly telling the percentages. So just see how many months you have used it. If you have used it for 0 to 3 months, so increase it by 3 months, 0 to 3. Then next plus 3 will be 6 months. So 0 to 3, then 3 to 6, then 6 to 9, 9 to 12, 12 to 15, 15 to 18, and more than 18. Okay, this is the slab. More than 18 you will not get. Any benefit. Okay, so 3 months you need to increase. And it starts at 95%. 0 to 3 months means 95%. Thereafter it gets reduced by 10% up to 75%. 95, 85, 75. Thereafter means first 3 slabs 10% reduction. Thereafter next 3 slabs 5% reduction. So 70 over na, next 70, 65, 60. After 18 months you will not get anything. Okay, so first you need to increase the period by 3 months. 0 to 3, 3 to 6, 6 to 9, 9 to 12, 12 to 15, 15 to 18, more than 18, 0. And it starts with 95, 85, 75. Thereafter 70, 65, 60. So this much percentage of what? Customs duty paid you will be getting as a refund. So this is in case of 74 subsection 2. Okay. So we have seen what is the duty drawback as per the reduced rates. And next, mandatory prohibition. So here there are few cases where you will not get duty drawback. 74. What are they? If the amount of duty drawback that you have computed is less than 50 rupees, you will not get duty drawback. Duty drawback less than 50 you will not get. Second condition, market price of the exported goods is less than the duty drawback. So you are exporting some goods and those exported goods is having some market value. So that market value of the exported goods is less than duty drawback. Why it will happen? So I'll give you one example. Say I purchased one iPhone. Okay, I purchased one iPhone and the value of that iPhone is 1 lakh. iPhone, say, this is what versions will be coming now. iPhone 13 Pro Max, like that I have purchased iPhone 13 Pro Max, 1 lakh. Customs duty paid on import will be 30%, say 30,000. Now what I did, this iPhone 13 Pro Max, I gifted it to my wife, but she did not use it. So she don't know how to use it. Say she did not use it, but she kept it because I gave it as a gift. So she kept it. And after few days, so she told, like, I have one unused phone. So if you want to use it, or you can sell it like that. So she gave box piece, not at all used. And now I am trying to sell it. Definitely its market value will be very, very less, even though not used. Even though not used, because of the effects of time, certain technological products or electronics, the value will come down. So automatically the value has come down. As the value has come down, so therefore this value of these goods after use, so it is exported as such without use. After 18 months, market value of such goods came down to 20,000 rupees. Whether duty drawback is available in this case. Now, what is the duty drawback if imported goods are exported as such without use? 98% of customs duty. So 30,000 into 98% is what? 29,400. Okay. Then what is the market value at the time of export? The market value at the time of export is only 20,000. So as the market value at the time of export is less than the amount of duty drawback, we will not get the duty drawback in this case. Okay, so that's the answer for this. So in this case, duty drawback not available. So what are the two cases duty drawback not available? Even though all other conditions are satisfied, if the amount of duty drawback is less than 50 rupees, or if the market value of the exported goods is less than the amount of duty drawback, then we will not get the duty drawback amount. Then discretionary prohibition. Sometimes what will happen, the goods are exported and those exported goods are likely to be returned back to India. So we are exporting goods from India to outside India, and those exported goods are likely to be returned back to India. So in that case also, we will not get the duty drawback. So when it is likely to get back to India, let's see an example for this. You are importing goods from Germany. When you are importing goods from Germany, so that goods value is somewhere like 100 lakhs, 1 crore. On that, 30 lakhs you have to pay as customs duty. You imported the goods from Germany, you paid 30 lakhs, and you exported it to, say, Pakistan. And from Pakistan, when you are exporting, so you will get duty drawback. How much? 98%. So 30 lakhs into 98%, you got as duty drawback. Now from Pakistan through land route, you can bring it back to India without informing the customs, etc. So literally, you imported goods into India by just paying 2%. So first you paid 30. First you paid 30%. So not even 2%. So 2% means, say, 30 lakhs na. So 30 lakhs into 98%. So 29 lakh 40,000, just 60,000. So 60,000, if you see on 100 lakhs, so that will be what? That will be hardly some 6%. 6%. So that much only you have made the payment. So you are getting the duty drawback here. So first you pay customs duty and you are getting as duty drawback 98%. So the loss is that 2% of that 30 lakhs only is the loss. So that much only you are paying. So you got the goods. So whenever the goods are likely to be smuggled back into India, central government may notify that no duty drawback shall be admissible if any goods which post-export are likely to be smuggled back into India. In that case, they will prohibit. This is known as discretionary prohibition. Then identity satisfaction. Of course, the base of 74 is what? The exported goods and the imported goods, or imported goods and the exported goods should be same. So we need to satisfy to the ACRDC that the imported goods are only exported. Exporter shall establish before the proper officer that export are the one which were imported earlier. So that has to be proved. Okay. Then, so interest, if you see, if the duty drawback amount is not paid to the claimant within 1 month from the claim date, so then interest will be at the rate of 6% per annum from the date after expiry of 1 month till the date of payment of duty drawback. So we made a duty drawback claim. What is the time limit within which they should give us duty drawback? 1 month. If not, they need to pay us interest at the rate of 6% after expiry of 1 month till the date we are getting the duty drawback. Suppose by mistake we have claimed the duty drawback amount erroneously. If duty drawback is claimed erroneously, then from the date we got the duty drawback amount till the date we are repaying them, we need to pay the interest at 15% per annum. As we all know that the interest rate in case of customs is for payment to government is 15%. So 15% per annum from the date of payment of duty drawback till the date of recovery of duty drawback amount. Okay, so this is interest in case the amount is payable by exporter to the government. This is interest in case the amount is payable by government to exporter. So there is a difference. So whenever we pay to government, higher interest rate 15%. When our government is paying interest to us, lower interest rate, that is 6%. Okay, then next one. So this is a non-availability of duty drawback. In case of 74 subsection 2 only this restriction is there, not in case of 74 subsection 1. This is only in case of 74 subsection 2. What is 74 subsection 2? If the imported goods are exported after use, as such after use, then in that case 74 subsection 2. What does 74 subsection 2 says that? So you are importing some goods, you are exporting it as such after use. So but these 4 cases you will not get the duty drawback. What are those 4 cases? Wearing apparel. So you are importing apparel and you are using it and you are exporting it. As you are exporting it after use, you will not get duty drawback. Tea chest. Tea chest means so wooden boxes which are used for the purpose of storing the tea is known as tea chest. So you are importing the wooden boxes, you are using it and then you are exporting, you will not get duty drawback. Exposed cinematograph film. So this is not applicable at present because nowadays no one is importing the reels. So previously what they used to do, they used to import the film reels, they used to record it on the reels and then they will be sending back that reels for outside India for washing it and again it will be re-imported. So this exposed cinematograph films, but at present it is not applicable. Then unexposed photograph films, papers and plates and x-ray films. So these x-ray films basically imported, used it and then exported, then also will not get duty drawback. So what are the 4 woods where we will not get duty drawback under 74 subsection 2? Wearing apparel, tea chest, exposed cinematograph film and unexposed photographic films. So this is about duty drawback under section 74. Okay, now we will see duty drawback under section 75 and we also see the comparative differences between that. Okay, so section 75, when is it admissible? When the imported goods are used in manufacture of goods which are then exported. And here if you see there is no time limit. So no time limit means what? The imported goods can be manufactured and it can be exported within any time. So there is no time limit in this case because if you remember, in case of section 75, I told you that the imported goods are used in manufacture of finished goods which are then exported. So which means that there is no condition that so the imported goods and the exported goods should be same. So because of that, so there is no time limit. Here they will be giving duty drawback. Also one more point is that the duty drawback in case of section 75 is a percentage of FOB value of exports. So whatever is the FOB value of exports, on that FOB value of exports, a percentage will be given as a duty drawback. So that's how it will be working. So you look into the rates of duty drawback. We have 3 different rates. First we have all industry rate. What is this all industry rate means? It means that so whenever we are exporting some goods, so depending upon the product, so there will be a notified percentage which will be given by the government. So there is a notification for that. In that notification we have list of goods and what is the duty drawback rate. That duty drawback rate is known as all industry rate. So we need to see whichever product we are exporting and take the FOB value of export. On that you multiply that percentage. You will be getting the all industry rate. That is the amount of duty drawback. Then rule 6, brand rate. Brand rate here is sometimes it so happens that so there is no notified rate for this product. Okay, so say we are exporting a product and for that product there is no notified rate, then in that case we can request the government so to prescribe a rate, and that will be called as brand rate. When no all industry rate is fixed in the duty drawback schedule, so then it will be brand rate. Rule 6 will be applicable. And rule 7, special brand rate. Special brand rate is whenever we have duty drawback as per the notified rate and the amount of duty drawback is less than 80% of the actual duties incidents, then we can go for special brand rate. So have a look into this. That is, here import of goods is 10 lakhs, and on this 10 lakhs the basic customs duty is 1 lakh, social welfare surcharge is 10,000 and IGST is 1,33,200. Now we are making an export, so using this 10 lakhs worth of goods we made the FOB value of exports 28 lakhs, and the duty drawback notified is 3.5% of FOB value of export. So means how much we will be getting? 28 lakhs into 3.5% is 98,000. So 98,000 divided by 1 lakh 10,000. So because IGST is not covered under section 75 na, section 75 gives a benefit only to recover the basic customs duty and the social welfare surcharge, not the IGST. So therefore 98,000 divided by 1,10,000 is 89%, which is greater than 80%. So can we make request for special brand rate? No, we cannot make request for special brand rate because the duty drawback as per the all industry rate is more than 80% of the customs duty incidents. Due to that reason, we cannot go for special brand rate. What if the duty drawback is 1.5% of FOB value of export? Suppose if the duty drawback is 1.5% of FOB value of export, so now we need to see how much is the duty drawback amount that we will be getting. So duty drawback as per all industry rate is 28 lakhs into 1.5%, that is 42,000. So 42,000 divided by 1,10,000, if you see 38.18%. So this 38.18%, whether it exceeds 80% or it does not exceed 80%, it is less than 80%. So as it is less than 80%, we can definitely go for special brand rate. So application can be made for special brand rate. Okay, but remember here one important point. Suppose if you have already claimed the duty drawback as per all industry rate. Suppose if you thought, okay, at least 42,000 we are getting, so let's claim this and then go for special brand rate, application cannot be made. So that is this note. However, application for special brand rate cannot be made if duty drawback is already claimed as per all industry rate under rule 3. So once you claim duty drawback as per all industry rate, then you cannot go for special brand rate. That is an important point which you need to keep in mind. Okay. So therefore, what are the three different rates that we have in case of rule, that is in case of section 75? All industry rate, special brand rate, special brand rate. When all industry rate, so that all industry rate is normal, it is generally. And related to this all industry rate, there is one special point. Say this, as per rule 4, central government may revise amount or rates determined under rule 3. Why it will happen? Whenever a person is trying to get a more benefit than his incidents, so then the all industry rate can be reduced. I gave one example to understand that. You can see in this page, like later page. So a person is importing some goods and the value of the imported goods is 1 lakh, customs duty 12%, social welfare surcharge 10%, IGST 10%. So we have this 12,000 customs duty and social welfare surcharge will be 1,200 and IGST will be 20,336. Plus he is also making a domestic procurement. So domestic procurement is 50,000, GST at 18%. Now using these imported goods as well as domestic procurement, he made some finished goods. The value of that finished goods exported is 3 lakhs. And the duty drawback notified is 7.5% of FOB value, which means how much will be the duty drawback that he will be getting? 3 lakhs into 7.5%, 22,500. That much only the benefit? No. IGST also can be taken as credit. So this 20,376 can be taken as ITC and on that refund can be claimed. So 29,376 plus 22,500. So total 51,876 is the benefit that he will be getting. But what is the total tax incidence on him? If you see the total tax incidence on him, you just do the calculation: 12,000, 1,200, 20,376 and 50,000 into 18%. So what is 50,000 into 18%? 9,000. Okay, if you add these things, the total duty incidence is 42,756. Hope you understood how we got this 42,576. First we have taken 12,000, then we are taking 1,200, then we are taking 20,376, then we are adding 9,000. So if you take all these things, 42,576 will be taken as the total duty incidence versus the benefit is 51,879, which means this person is getting a benefit which is more than the duty incidence. In that case, this 7.5% of FOB value is the duty drawback rate now. That can be reduced to, so maybe 5% or 4% as per rule 4. Okay. So that is this point. As per rule 4, government is having power to reduce the duty drawback rate, which is all industry rate notified, can be reduced. Then there is brand rate. So when brand rate will be applicable? When the all industry rate is not notified for a product, brand rate will be applicable. And the brand rate here, if you see, so exporter shall apply for fixation of brand rate, and until fixation of brand rate, exporter may request for grant of duty drawback on a provisional basis. So provisional basis, so exporter can request, okay, until the time brand rate is fixed. And special brand rate already we discussed. For that also one important point is what? So exporter shall apply for fixation of special brand rate. He is not entitled to claim AIR. So he should not first claim AIR and then go for SBR. So then till fixation of SBR, suppose if he is not going for AIR, directly he make request for SBR. Till that time, can he ask for provisional duty drawback? Yes. So exporter may request for grant of duty drawback on a provisional basis. Okay. So that is about this. If you see the mandatory prohibition, so these first 2 points are same. What is the first point? That is duty drawback less than 50, you will not get any amount of duty drawback. That is common here also. And the market price of the export goods is less than duty drawback, then we will not get the duty drawback amount. For example, you say this: value of exported goods in the Indian market is 30,000. But that 30,000 worth of goods is inflated in case of export by the exporter to get more benefits. So FOB value declared by the exporter is 4 lakhs. And the duty drawback is 10% of FOB. So 4 lakhs into 10% is what? 40,000. As the market value of the goods is less than the amount of duty drawback will not be allowed in this case. And next point is that the maximum duty drawback is 1/3 of the market price of the exported goods. So when is this applicable? The first point is, if the market value of the exported goods is less than duty drawback amount, we will not get duty drawback. Suppose if the market value of the goods is more than the duty drawback amount, we will get. But in that case, what is the maximum duty drawback amount? 1/3 of the market price of the goods. For example, export price is 1 lakh and Indian market price is 50%. And duty drawback all industry rate is 30,000. So now 30,000 rupees, so is the duty drawback, but the market value is more than 30,000. So we'll get duty drawback. But what is the maximum duty drawback? 50,000 into 1/3. So 16,667 rupees is only the amount of duty drawback that the person will be getting. Then rule 8, no duty drawback allowed if the value of exported goods is less than the value of the imported materials used therein. What does it mean? For example, my import value is 1 lakh. My export value is 98,000. So there is a negative value addition. So FOB value of export should be greater than the CIF value of import. So value of import is 1 lakh, but the export value is 98. So we will not get duty drawback. Okay. Then suppose if they have given a notified value addition. So for example, they are telling there should be a 15% value addition. Means your import value is 1 lakh. And your export value should be 1,15,000 or more. Suppose if it is less than 1,15,000, then we will not get the duty drawback. No duty drawback allowed if the value of exported goods is not more than the notified percentage of the value of imported materials used. Suppose, sir, what if it is equal? So in this case, first point, so the division is simple here. Is the value addition notified or value addition not notified? If the value addition is not notified, first point, what is it they are telling? So it should not be less than. It should not be less than means equal to is also okay. Okay. So that is FOB value of export. FOB value of export. FOB value of export should be greater than or equal to CIF value of import. CIF value of import. This is when FOB value of export is greater than or equals to CIF value of import. This is when if the value addition is not notified. Value addition not notified. If the value addition is not notified, we need to go by this. What if the value addition is notified? Suppose if the value addition is notified, so what we need to check is that FOB value of export, FOB value of export is greater than, because it's not more than means you will not get. So it should be more than, not equal to, more than CIF value of import, CIF value of import plus value addition, plus value addition. Okay, so that's what I said. So if the import value is 1 lakh and notified value addition is 15%, therefore value of export should be 1 lakh plus 15%, that is more than 1,15,000. Then only we will be getting the duty drawback in this case. So then we have something called as discretionary prohibition. This discretionary prohibition is common for both the cases. What is that? If the goods are exported which are likely to be smuggled back into India, then we will not get the duty drawback in this case. So no duty drawback shall be admissible if any goods which post export are likely to be smuggled back into India. Then identity satisfaction. So in case of 75, no need to prove that the imported goods and the exported goods are same. Okay, so that is the difference. Next one, we have this interest point is common for both 74 and 75. And here, if you see, in case of 75, there is no separate application for duty drawback. We do shipping bill, we file the shipping bill. That shipping bill itself will be treated as claim of duty drawback. But in case of 74, we need to make a separate application for duty drawback. Okay. And next one. So these are the points that we have with respect to duty drawback, section 74, 75, what are the differences and what are the points that we have seen. And here, this duty drawback under 74 subsection 1 can be compared with refund under section 26A. We have something called as refund under section 26A. What is the connection between this 74 subsection 1 and section 26A? First, in case of 74 subsection 1, so we are importing the goods and those imported goods are exported as such without use. How much duty drawback we will be getting? 98% of the customs duty paid we will get now. But in case of section 26A, if the imported goods are exported, 100% of the customs duty paid on import we will get as a refund. So compared to 74 subsection 1, 26A is better. So now we need to know what are the differences. Okay, when we will get 26A. First priority is 26A. If 26A fails, then only we will go for 74 subsection 1 situation. Any case when the imported goods are exported. But here, imported goods are defective or not conforming to the specifications, then only we will get 26A benefit. So remember, when 26A benefit, the imported goods should be defective or not according to the specifications. But 74, any case. And so what we should do, we should export it. What are the alternatives for 74 subsection 1? Either we can sell it to SEZ or we can sell to a foreign going vessel or aircraft. That is also treated as export only. So if we are selling to a special economic zone or if we are selling to a foreign going vessel or aircraft, an aircraft or a vessel which is taking goods or people from India to outside India, that is known as a foreign going vessel or aircraft. So then also it will be called as export. We will get the benefit. But in case of 26A, we should relinquish the title or destroy the goods. That is the alternative to export. Either the imported goods are defectives, either export it or destroy it, or you relinquish the title. So relinquishing means what? Leaving the title. Okay, any of these three things you should do. What is the time limit? 74 time limit already you know. So 2 years from the date of payment of customs duty, and it can be extended by CBIC. But in case of 26A, that much time is not there. 30 days plus 3 months from the date of clearance for home consumption. So whenever the customs officer passes the order for clearance for home consumption, from the date within 30 days, or it can be extended for a further period of 3 months. So we need to either export or destroy or relinquish the title. Now, once you completed that, what is the time limit within which you need to make application for refund? So in case of, this duty drawback, so within 3 months from the date of export, or it can be extended for a further 3 months by ACDC, Assistant Commissioner, Deputy Commissioner, or 6 months by Commissioner. Whereas here, from the date we have exported or destroyed or relinquished the title, within 6 months we need to make application for refund. Here duty drawback is 3 plus 3 plus 6, but here only 6 months. And is duty drawback applicable in case of perishable goods? Yes, but section 26A refund is not applicable in case of perishable goods. Now, once we make the application for duty drawback or refund, what is the time limit within which the duty drawback or refund should be granted? So in case of duty drawback, once we make duty drawback claim within 1 month from the date of application, we need to get the duty drawback. Otherwise, interest will be at the rate of 6% per annum. Whereas in case of 26A, so once we make application for refund within 3 months, if they are not granting, then only interest will be 6% per annum. So in case of duty drawback 1 month, here it is 3 months. Also remember, once you claim duty drawback under 74 subsection 1, you will not get the refund under 26A. Okay. So anything you need to claim, any one of these two. And with this, we completed the duty drawback provisions. Now we are moving on to some questions on this duty drawback, so which I have given at the end after this SEZ topic. So you look into some questions related to this. Question number 1. So these are some past exam questions of CA, CMA and all. With reference to drawback on re-export of duty paid imported goods under section 74, answer in brief. So they are asking as per 74. What is the time limit for re-exportation of such goods as such? 2 years, plus it can be extended for a further period by CBIC from the date on which we paid the customs duty on import. What is the rate of duty drawback if the goods are exported without use? 98% of the customs duty paid. Is the duty drawback allowed on re-export of wearing apparel without use? Yes. See, 74 subsection 2 only, those notified goods will not get duty drawback. Wearing apparel, teachers, exposed cinematograph films or unexposed photograph films, X-ray plates, etc. That is for 74 subsection 2. But in case of 74 subsection 1, we will get duty drawback. Okay. But the imported goods should be exported as such without use. Means you import the apparel without cutting the tag, etc. You export it. So then you will get duty drawback 98%. If you cut the tag and if you wear it and use it and then you are exporting, you will not get duty drawback. Next one, question number 2. If the duty drawback of 1 lakh is paid by department to assessee erroneously on 1/5/2021, so the assessee, importer or exporter, so has got the duty drawback erroneously, and it is demanded by the department on 15/6/2021 and paid by the assessee on 11/8/2021 within 2 months from the date of demand. Calculate interest on duty drawback. So in case of erroneous duty drawback, we need to compute interest at the rate of 15% from the date we got the duty drawback till the date we are making the payment of the duty drawback amount. So what is the date on which we got the duty drawback? Erroneously 1st May. And when are we returning it to the government? 11th August. What is the period for which we need to pay interest? So this May. So we need to take in May 31 days. So May we need to take 31 days. So 1st May now we got. So don't count that. So from 2nd May we take. So 31 minus 1, 30 days in May, and June 30 days, July 31 days, and August 11 days. So total 1 or 2 days. For this 1 or 2 days, we have to pay the interest. So we need to, from the date on which we got the duty drawback till the date we are returning it. So don't count that from date, the next date you count 1 or 2 days. So 1 lakh is the duty drawback. 1 lakh into, we need to take 15% into 102 divided by 365. So 4,192 rupees will be taken as the interest. Okay. Then next one. This is when we are paying, not when we are getting the amount from the government. Question number 3. MD Jefferson exporters have exported raw iron outside India. FOB value of 1000 ton of gold exported is 3 lakh. Rate of duty drawback on such export is 200 per ton. Market price of the goods is 1,75,000. You are required to ascertain whether MD Jefferson exporters is entitled to duty drawback, and if yes, what is the amount of the duty drawback. First, what is the duty drawback? They are telling 200 per ton. How many tons exported? 1000. So 1000 tons into 200 per ton will be 2 lakhs. This is the duty drawback as per all industry rate. But what is the market value of the goods? Only 1,75,000. As the market value of the goods is less than the amount of duty drawback, we will not get duty drawback. Okay, we will not get the duty drawback amount. Understood? Then next one. Question number 4. A exported a consignment under duty drawback claim consisting of the following items: 200 pieces of pressure stoves, mainly made of brass, at rupees 80 per piece, and duty drawback rate is 4% of FOB. So 4% of FOB 16,000. So 16,000 into 4% is what? 640 rupees. That is the amount of duty drawback. Then 200 kgs of brass utensils at 200 per kg. Okay, and 24 rupees per kg is the duty drawback. How many kgs? 200 kgs na? 200 into 24. So 4,800 will be the duty drawback. Then third one, 200 kgs of artware of brass at 300 per kg, and duty drawback is 17.5% of FOB subject to maximum 38 rupees per kg. So 60,000 into 17.5% or 38 into 200 kgs. So we need to take 17.5% of 60,000, that is 9,975, or number of kgs 38 per kg. But if you see here on examination in the docs, weight of brass artware were found to be 190 kgs, means what we have actually exported is only 190 kgs. So we need to get the duty drawback only based on 180 kgs. So 38 per kg into 190 kgs, whichever is less. So 7,220 we will get as duty drawback. Then next one, see, these QR codes are the explanatory videos for this. So you can solve these questions for which I have given the QR codes, so that if you are not able to understand the answer, you scan this QR code, you will get the answer explanation for these questions. But this question number 5, 6, 7, you can take for practice. Then 8, X Limited has exported following goods. Product P, FOB value worth 1 lakh, and the rate of duty drawback on such export of goods is 0.75%. And product Q, FOB value worth 10,000 and the rate of duty drawback on such export of goods is 1%. Will X Limited be entitled for duty drawback? So if you see the FOB value 10,000, 10,000 into 0.75, 10,000, 1 lakh, 1 lakh into 0.75% is 750. Yes, we will get duty drawback. Second case, 10,000 into 1%, 100, which is also more than 50. So we will get the duty drawback. The restriction is it should not be less than 50. Here in both cases it is more than 50, so we will get the duty drawback. Ninth question also you can take for practice. Then question number, and if you don't know the answer, like if you are not able to understand the answer, please scan this QR code. Then question number 10, XYZ Limited exported a consignment of manufactured goods. The company has paid import duty and sectoral excise duty on the components used in manufacture. Question number 10, XYZ Company Limited exported a consignment of manufactured goods. The company has paid import duty and central excise duty on the components used in the manufacture. A duty drawback rate has been fixed for these goods. The ship carrying the consignments runs into a trouble and sinks in the territorial waters. So whenever the goods are not crossing the territorial waters, or the goods are not said to be exported, so Customs Department refused to grant the duty drawback for the reason that goods did not reach their destination. As a consultant of XYZ Limited, you are required to prepare a brief note with the reason whether the stand taken by the Customs Department is correct in law. So for this, we have one case, Rajendra Dyeing and Printing Mills case by Supreme Court, wherein it is held that if the goods are not really exported, we cannot claim the duty drawback. So export means taking goods from India to a place outside India. So if the goods are crossing the territorial waters, it is okay. It is export, then duty drawback cannot be denied. But the vessel in the present case has sunk within the territorial waters. It has sunk within the territorial waters of India, and therefore there is no export. Accordingly, no duty drawback is available. So this is based on a Supreme Court decision, Rajendra Dyeing and Printing Mills Limited. Okay. Then another question. So this is for your practice. Yet another question. You see question number 12. Mr. X was erroneously refunded a sum of 20,000 in excess of actual duty drawback on 26/2021. The same was demanded by the department on 14/8 and the same was returned. So already we saw this. So this is related to what? Erroneous duty drawback, interest at the rate of 15%. Okay. So that computation related question. Then question number 13. With reference to customs and central excise duty drawback rules, briefly state whether an exporter who has already filed a duty drawback claim under all-industry rate can file an application for special brand rate. No, it is not possible. So already if he is going for all-industry rate, he cannot request for special brand rate. Already we saw that point. Then, so these two questions you take for practice. Question number 16. Messrs. Deepak Business Limited had imported goods during 2021. Customs duty has been paid for rupees 20 lakh at the time of import. These goods were used and later re-exported after 23 months of import. Is Mr. Deepak Business eligible for refund of customs duty paid at the time of import? If so, how much? Okay. So if you see here, imported goods are exported after use 23 months. So is it goods imported by individual for personal purpose? No. Is it motor vehicles? No. Other cases, more than 18 months, greater than 18 months, whether we will get any duty drawback? No. So no duty drawback under section 74 subsection 2. We will not get duty drawback because we have only 18 months. So because it is beyond a period of 18 months, so we will not get duty drawback. Then another question. Messrs. Dynamic exporters exported goods having a FOB value of 10 lakhs. The all industry rate is 5%. Market price of the goods is 40,000. So 10 lakhs into 5% is 50,000. But the market value is less than 50,000. So we will not get the duty drawback in this case. So dynamic exporters is not entitled to get any duty drawback in this case. Then other questions, other two. So wherever QR code is there, that is for practice. You try that. And if you don't know the answer, you scan the QR code, you will be able to see the explanation video. Then question number 20. So this is your CMA final exam question. For 6 marks they have given. Calculate the amount of duty drawback allowable under section 74 of Customs Act in the following cases. Suresh imported a motor car for his personal use and paid 5 lakhs as import duty. The car is re-exported after 6 months 20 days. Car. In case of motor vehicle, it is 100% minus 4% for every quarter or part thereof in the first year. So it is first year. How many quarters? 6 months 20 days means 3 quarters. So 3 quarters into 4% means 12%. So 100 minus 12. 100 minus 12 is what? 88%. So 88% of 5 lakhs, that will be 4,40,000 you will get as duty drawback. Then second, Nikita imported wearing apparel and paid 50,000 as import duty. As she did not like the apparel, these are re-exported after 20 days. Okay. So after 20 days means it is assumed that she used it and exported. So we will not get duty drawback. Assumed that wearing apparel or re-exported after use. Suppose in the question clearly it is given that it is a re-exported without use. Then in that case, out of this 50,000, 98% we will get as duty drawback. Okay. Then next number 3, High-Tech Limited imported 10 computer system paying customs duty of 50 lakhs. Due to some technical problems, the computer systems were returned to the foreign supplier after 2 months without using them at all. So 98% of the customs duty paid we will get as duty drawback. So 50 lakhs into 98%, 49 lakhs will get as duty drawback. So it's a simple one only. You need to remember that rates. Then question number 21. compute the interest payable to an exporter. To an exporter means who is going to pay this interest? This interest is payable by government to the exporter. So then the interest rate will be 6% per annum. In the following case of delayed payment of duty drawback as per Customs Act, the claim was made on 30th June for 80,000 and was settled on 15th September. What is the provision? Once the duty drawback claim is made within 1 month, the duty drawback should be given. 30th June, na? 30th June, 1 month is what? So 30th July. So now beyond 30th July, you count the number of days. So 1 day in July, July 1 day, August 31 days, and September 15 days. So this is the number of days for which we will be getting, that is 47 days we will get the interest. At what rate? 6%. So after 1 month only interest will be computed. 6% on what? Duty drawback amount. How much is the duty drawback amount? 80,000. So 80,000 into 6% into 47 by 365, 618 rupees. Remember, as this attempt is June 24, there is a possibility that we may take leap year 366 days. When we need to take leap year 366 days? In the numerator, if you are taking February month, if you see here, the numerator is only July, September, February is not coming. So in February, 29 days will not take. So denominator, we don't have to take 366 days. Only in numerator, February month comes and we take 29 days. In denominator, we need to take 366 days. Okay. Then number 2, compute the interest payable by the exporter under the Customs Act 1962. In the case of recovery of 10,000 rupees paid erroneously on 3rd July 2020, demand for recovery was issued on 5th September and the exporter paid back the amount on 3rd November 2020. So he got the erroneous duty drawback on 3rd July, and when he made the payment 3rd November. So 3rd July to 3rd November. In July, you don't take 3rd. So 31 minus 3. So from 4th July, you need to take. So that will be 28 days in July, then 31 days in August, then 30 days in September, 31 days in October, and 3 days in November. Okay, so he made the payment on 3rd November, till that date. So 28 plus 31 plus 30 plus 3, 123 days. For this 123 days, we need to compute interest at 15% on duty drawback 10,000. So 505 rupees will be payable as the interest. Then this is related to refund. What is the time limit for computing the refund in case of customs? 1 year from the relevant date. What is that 1 year from the relevant date? Then list the important aspects to be borne in mind while claiming duty drawback under section 75. So related to 75, those provisions we need to write. Then list the goods which are not entitled for duty drawback. What are not entitled for duty drawback? Teachers, wearing apparel, that is there, that one. Then this question number 25, Times Graphics has imported a machine again from its holding company in Japan on 12/1/2021 after paying customs duty 15 lakhs for use in its factory and re-exported on 10/10. You are required to advise Times Graphics regarding duty drawback that will be available. They are using it. What is the period for which they are using it? So 12/1 to 10/10/2021. So what is the number of quarters? It's only first year. Number of quarters, if you see 12/1 to the number of months, because it is used 74 subsection to number of months. So 12/1, so January to February, March, April, May, June, July, August, September, October, 9 months. 9 months means exactly 9 months, because 12/10 is only beyond 9 months. So therefore 10/10 is within 9 months. So 9 months, up to 9 months, how much is the percentage? 0 to 3, 3 to 6, 6 to 9. It will come in the third case. So 95, 85, 75% will be taken, because that is the provision that we learn. 0 to 3, 3 to 6, 6 to 9. So here it starts with 95, then it gets reduced by 10%, thereafter it gets reduced by 10%. So 75% will be taken in this case. So 15 lakhs into 75%, 11,25,000 will be taken as the duty drawback amount. Then question number 26, what are the exceptions provided under section 27? So this is refund subject to unjust enrichment. So usually whenever we are claiming refund, it is subject to the provision that, so we need to ensure that we have not transferred the burden to the next person, but we don't have to prove unjust enrichment in some cases. So these are those cases. Then what is the relevant date in case of section 26A? Already we have seen, if the goods are exported out of India, from the date we got the lect export order, and relinquishment of title, date of such relinquishment, when the goods are destroyed, date of such destruction. So from that date we need to, from 30 days plus 3 months we need to do this, and from here within 6 months we need to make the application for refund under 26A. So just now we discussed 26A related provisions. So these are the questions on duty drawback and refund that we have. And the last area that we have into the discussion is SEZ provisions. Have a look into this. Special Economic Zone Scheme with amended SEZ rules. First, what is a Special Economic Zone? It is a separate island within the territory of India developed by government to promote economic growth. So basically, in order to enhance the exports growth and the economic growth, so they have created a separate area called as Special Economic Zone. And the provisions related to Special Economic Zone are contained in SEZ Act 2005 and SEZ Rules 2006. And the first SEZ that was established in India is Kandla SEZ, and near Kandla Port, Gujarat. And total we have 265 operational SEZs in India at present, and the highest number of SEZs are in Tamil Nadu. Okay, and what are the tax implications on SEZ? Now say this, say there is a SEZ in Tamil Nadu and the rest of the country is called as DTA, Domestic Tariff Area. So there is a Special Economic Zone in Tamil Nadu and the rest of the country is known as Domestic Tariff Area. Whenever supply is made by SEZ, supply by SEZ, say from Tamil Nadu to Andhra Pradesh, supply is made. So this supply made by SEZ, for a person in Andhra Pradesh, it is treated as import. So there is a SEZ in Tamil Nadu which is making supply to a person in Andhra Pradesh. Now for the person in Andhra Pradesh, it will be called as import, and they need to pay customs duty along with IGST to the person in Andhra Pradesh. Suppose if it is supplied to SEZ, say from Maharashtra, okay, the supply is made to SEZ. From Maharashtra, the supply is made to SEZ. Then in this case, it will be treated as export, but customs duty not payable, and for GST, it is treated as zero rated supply under GST. For customs duty, it is not treated as export, customs duty not payable, but it will be treated as zero rated for the purpose of GST. Then next, suppose if the goods are imported into SEZ, we don't have to pay customs duty. Also, if the goods are exported from SEZ, customs duty is not payable. Okay, so if the goods are imported into SEZ, customs duty not payable. If the goods are exported from SEZ, also customs duty not payable. So these are the tax implications. 4 points you need to keep in mind. Then exemption under income tax with respect to export income. 100% of the profits for first 5 years, 50% of the profits for next 5 years, and 50% of the plowed back export profit for next 5 years. And that is whatever export profit that is plowed back, retained. Exemption from minimum alternate tax. So MAT provisions are not applicable. And then what are the other incentives to SEZ? There is a single window clearance for state and central level approvals. So we don't have to go with different authorities. Single window clearance. License to import is not required. Usually under foreign trade policy, people are required to obtain the licenses for restricted goods. That is not applicable in case of SEZ. In manufacturing sector, 100% FDI is allowed except for few sectors. Usually there is a restriction on foreign direct investment. Just like that person outside India cannot invest in India. But with respect to few sectors, except with respect to few sectors, in all other cases 100% FDI is allowed. And they are eligible for MAIS, SEIS and RODTP duty credit scripts. This MAIS and SEIS is not applicable at present. So this RODTP duty credit scripts which is there in FTP, that will be eligible. And profits earned are permitted to be repatriated freely without any dividend balancing. Okay, So then domestic sale of waste, scrap and rejected goods are permitted with payment of applicable duties. Then what is the difference between SEZ and EOU? So this may be asked as a question. Supply to SEZ is treated as export, but supply to EOU is not treated as export, is treated as deemed export. Supply by them, so zero rated under GST. So two options we have, either pay IGST and get refund, or don't pay IGST and get refund of ITC. Okay, don't pay IGST and get refund of IGST, don't pay IGST and get refund of ITC. Whereas in case of EOU, normal supply, and that will attract GST. Okay, so this is the tax implication. This is the tax implication. Then next, so where it can be established, SEZ only in designated sites, but EOU anywhere. Minimum investment criteria is not applicable for SEZ, but in case of EOU, 1 crore in plant and machinery, and board of approval may allow with lower investment criteria. Import and export clearance achieved within the zone itself, but here it is fast track clearance scheme. Then SEZ approval mechanism. So first there is a developer, so who will submit the proposal to central state government or submit proposal to the board of approval. And suppose if it is submitted to state government, they will forward the proposal to the board of approval within 45 days. That board of approval will approve, then the central government notifies the area of SEZ, or they may reject it. And some key amendments related to this: no minimum area requirement for setting up SEZ in biotechnology and health sector. Merger of 2 or more units in the same SEZ of the same legal entity has been permitted. SEZ can allow maximum 50% of their employees to work from home, and along with prior permission to temporarily remove goods such as laptops, computers, etc. Gems and jewelry units can take raw material outside the zone without payment of duty and brought back within 45 days. So these are some amendments in SEZ rules. So these are the points. So purely it's a theory topic. Maybe in MCQs it may be tested. For that it is relevant. So with this, we completed all the topics which are applicable for CMA final exams, and all the very best for your exams. Prepare well and do well. Thank you.